Welcome to Yeshas Academy. And just for some time, imagine that I am not a chartered accountant and I am a CA foundation student. And I, like a lot of you are watching this session here today in the class and live online slightly later, that I'm one among you and I'm writing a CA foundation. I'm writing my CA foundation examination along with you. And if I have this last 20 days, 30 days, or 40 days left for exam, how would I prepare for that accounts exam that I'm writing? That's what I'll be telling with all of you today. And come, let's crack this together. Shall we? Let's begin with the topic of accounting. The first and foremost question that all of us will have is what exactly do we mean by the word accounts? What we're going to discuss for 100 marks in your CA foundation. And in fact, we're all craving for the tag, no, chartered accountant. So once you pass the examination, not a foundation, but a final, you become a chartered accountant. But what is that accountant? What does that word accounts mean? The answer to this question goes way back in time. The time where we were all shouting, oh, in the cave, and we were not actually wearing the clothes like what you're wearing now. It was not fabric, but it was leather, actual leather, and sometimes leaves also. And we were writing on the walls, the cattle, the drawing of the cattle, the lines, number of days we survived, how many wheels did I make, how many wheels did I sell, and all of this. That's the origin of accounts. Accounts, in short, means a count of things. Starting from then, we've come to the point where accounts is something again that we have all around us. Starting with your Instagram account, Facebook account, LinkedIn account, Gmail account, bank account, investment account, stock account, demat account, all of these are also accounts. So in short, what do we mean when we use this word account? Account refers to a count of things, keeping a count, systematic record or track of things is what we call as accounts. But please don't write this in the exam. Accounts means my Instagram account, please follow, but that's accounts. The definition that we will write, talking about that, you can wait a minute. Fine. So talking about that, the definition of the word accounts as it is given in the AICPA definition is that accounting is an art of recording, classifying, summarizing in a significant manner and in terms of money, transactions and events which are in part or at least of financial character, which is with an intention of analyzing, interpreting, communicating thereof. Okay, summarizing, interpreting, something, analysis, classification, and summarizing, interpretation, and communication of the entire financial information. Don't expect 2 marks questions on this. No, that's second PU. They're now in foundation. Now, talking about the definition, the aspects of this definition will be learned in different stages in our chapter 1 and chapter 2. This definition cannot be learned in the first 5 minutes, cannot be finished in first 10 minutes, or you cannot say that you just mug up and you're done with the definition. Analysis, interpretation, presentation, summarization, interpretation, and communication is what we learn in entirely in chapter 2. We'll start with our transactions for now. So small underline on the word transactions and events, and we'll pop in to see what exactly do we mean by a transaction and what exactly do we mean when we use the word event. So all of us are humans. Okay. Some of us are humans. I'm sorry for aliens. You are also included. We are happy to take you and keep you as a part of our class, but Mr. ABD, you are an alien. So, talking about humans like us, all these humans do a lot of activities: bathing, eating, sleeping, buying, selling, business sometimes, giving service, and a lot of these things. All these are human activities. These are classified into one, which is non-economic activity. Next one is economic activity. Brushing, eating, sleeping, non-economic activity. Buying a brush, economic activity. Paying to eat the food, economic activity. Selling the food, economic activity. Buying a bed sheet, economic activity. Sleeping with that bed sheet, non-economic activity. So we'll classify all human activities into economic and non-economic. Economic activities will not become transactions. They'll become transactions only if they're related to business. I buy a toothbrush. Is it a transaction? It is economic activity. I need to ask. If I'm a seller of toothbrush, day in, day out, my objective is selling toothbrush. I wake up, sell toothbrush, sleep. I wake up, purchase toothbrush, sell toothbrush, sleep. So I am a toothbrush seller. To me, that's my business. Otherwise, I am not a toothbrush seller. In my old toothbrush, one cockroach laid one egg. So I bought a new toothbrush. That is a transaction, but it is a personal transaction. It is not related to business. So that's not what we're talking about in this case. In this case of accounting subject, we'll talk about human activities, which are economic activities which relate to business. So to call a human activity as a transaction, how many conditions should it fulfill? Number one, it should be economic activity. Number two, it should be relating to business. If it is non-economic or if it is not relating to business, it is not considered as a transaction. To be calling it a transaction, it should be economic activity. Second one, it should be relating to fantastic. Now let's quickly take some examples. Transaction is an economic activity relating to business. Economic activity basically means affecting money or money's worth. If it costs you some money or something equivalent to money, then we'll call it a transaction. Now I'll give you some examples. I want all of you to shout out and tell me if it is a transaction or it is not a transaction. Help me with this. To begin with, started business with cash of rupees 1 lakh as capital. Very good. That's a transaction. Green flag, transaction. Red flag, not a transaction. Okay, sir, she told me I'm not a transaction. No, that's different red flag. What I'm talking about here is something slightly different. Okay, you filled a bank application form to open a bank account. They gave you passbook and they gave you debit card. Not a transaction because it does not involve any money involved there. Next one. What if you deposit 70,000 rupees in a bank? Transaction. So, though you say that you're not paid in cash, it's affecting your bank balance. Purchase of plant by giving 20,000 rupees by check is considered as a transaction. How about appointing workers to work in your plant? Appointing workers is not a transaction because there is no cash affected in this specific case, though it is relating to business. How about you pay them wages of rupees 10,000? Paying them 10,000 wages will make it a transaction. How about you receive some free sample from your supplier before you order? Not a transaction. How about you give free sample? Transaction, because you give free sample as a part of advertisement. You pass the journal entry, advertisement account debit to purchase. When you receive free sample, you don't write journal entry. So receiving free sample, not a transaction. Giving free sample is a transaction. How about issuing price list to customers? Customers come to your shop, you give them a menu card. No, not a transaction. That is like invitation to offer. If they're really interested, they'll offer. If you accept it, it's a transaction. Okay, then issuing free samples to customers, I just mentioned. Issuing free samples to customer is a transaction, receiving free samples is not. So the last example, what if you sell goods to customers? Okay. If you sell goods to customers, that is considered as a transaction. So as you understand what is a transaction, now let's move on to understand categories of transactions. Transactions can be classified into two, depending upon the basis. One, depending upon the people involved, it can be called internal external. Depending upon cash involved, it can be called as cash transaction and credit transaction. If the transaction involves immediate settlement in cash, it's called as cash transaction. If it doesn't involve immediate settlement of cash, if the settlement of cash is postponed to another date, it is called as credit transaction. So when do we call it a cash transaction? Settled by immediate receipt or payment. When do we call it a credit transaction? When the settlement is not immediate, settlement is postponed to another future date. For example, let's see, I'll give you a set of conditions based on which you decide whether a specific transaction is cash or not. First and foremost, the transaction mentions that it is cash. If in the transaction they say it is a cash transaction, transaction itself is saying no, I'm a cash transaction, then it is what transaction? If the transaction doesn't mention, then it's a different case. So if the transaction mentions cash, it is cash transaction. What if the transaction specifically mentions goods sold on credit, goods purchased on credit? It's a credit transaction. If they mention cash, cash transaction. If they mention credit, credit transaction. What if they don't mention cash or credit? Then we need to check whether the name of the party is mentioned. If they mention the name of the party, credit transaction. If they don't mention the name of the party, cash transaction. Whereas, because if someone comes to you and then buys the goods, if they give you cash and then go, you don't care. If they buy goods, if they tell they'll pay tomorrow, you will ask them, what's your name? Why I should write no on my debtors list. Yeah, you are not a Sundri debtor, but I'll write it. Your name saying that this much money you owe. So if cash is mentioned, cash transaction. If credit is mentioned, credit transaction. If nothing is mentioned, check. If the name is mentioned, credit. If the name is not mentioned, cash. Not all the times they use the word cash directly. They use indirect reference, paid, received, settled. Yeah, in that case also remember that they're using the word cash indirectly. Let's take a small example where you need to identify a certain specific transactions whether they are cash or not. Take this. Help me with the first one. Started business with rupees 1 lakh as capital. Cash. Why? There is cash involved. You're bringing in cash as capital. How about depositing that 70,000 rupees into bank? Cash is deposited into bank because it is normal bank. It's not your blood bank where you deposit blood. So this is a cash transaction. How about when you purchase a plant by paying 20,000 rupees by check? Credits are credit because you did not give cash. Even if you give check was given immediately, no. Settlement is made immediately. This is also considered as a cash transaction. How about you paid wages to workers 10,000? Paid immediately, cash transaction. How about wages outstanding to the extent of 2,000? 2,000 rupees worth of wages are not paid. It has to be paid later. That makes it a credit transaction. Then come to the next one. How about purchased goods on credit? They mentioned credit. When they directly mention credit, it's definitely a credit transaction. How about purchase goods from Kiba? Wait a second. Have they mentioned cash? Have they mentioned credit? When they don't mention cash and credit, we'll check for the name. Have they mentioned name? Kiba is the name of a person. So it will become credit transaction. What if they say sold goods to Sakura 7,000? Have they mentioned cash? Have they mentioned credit? They mentioned the name of the girl. Useless, no, right? No, don't call so. You'll feel hurt. She also has feelings. So, yeah, you sold goods to her. When you sell goods to her, they've not mentioned cash credit, but they mentioned her name. This becomes a credit transaction. And next one, what if you sold goods to Sasuke for cash 7,000? They mentioned name. But they mentioned cash, no? The moment they mention cash, we don't care about the name. This becomes cash transaction. Then the last one on the transaction case, we will see the case of external and internal. So I told you it classification of transaction depends upon the basis. Basis can be settlement in cash. Basis can be people involved. Based on the people involved, we'll classify them into two categories: internal, external. What is internal? It does not involve another person. If it does not involve another person, what kind of transaction is it? Internal. If it involves another external person, then it is you do a transaction with yourself. Internal. You do a transaction with somebody else. External transaction. Sir, chichi, sir, what are you talking? I'm talking about transactions that can happen internally and externally. Let's take some examples before you misunderstand me. By the way, just clarifying, this is not an 18 plus video on YouTube. This even kids can watch this because commerce today is very important. Correct? No. Yeah, kids these days so young they have transactions. Yeah, they're starting a business. Yeah, 10-year-old kid, 8-year-old kid in a PAN number. PAN is not there already. They are directors in a company. Oh God. You have not seen? I've seen. Started business with cash of rupees 1 lakh as capital. Internal, external. Me, my business. There is no external person involved. Sir, but business is a different person. That's a different concept. Yeah. So if you don't tell that, then internal means something else. Then let's go to the next. Deposited 70,000 rupees with bank. External. Bank is another person. Bank is an artificial person. We're having a transaction with bank. It's an external transaction. How about you purchase a plant by paying 20,000 rupees check? You're buying plant from somebody, means somebody is selling. Only if somebody sells, you can buy. That somebody is another person. Yeah, sir, what if I feel like that person and me are same? Without him, I'm nothing. That is personal level. But here there are two different persons. Don't tell we are two persons, one soul. Sorry, two bodies, one soul. That soul concept is not there in accounting. Then what if you pay wages to worker 10,000 rupees? That wages paid to worker. Worker is another person, no separate person. Am I right? So external transaction. How about purchase goods for 2,500 rupees? If you're buying, you buy it from some other person, external transaction. How about your goods are destroyed and it is not insured? Internal. What if it is insured? Why? Insurance company is involved. For the goods that you burnt or your goods that got burnt, insurance company will give you money. It's an external transaction. How about depreciation that is charged on the plant? Internal transaction. Are you getting it? Because the journal entry is depreciation to plant. You and plant, only two of you. There's nobody else. Am I right? This is with regard to our transaction part. I hope you all understood transactions, internal, external, everything together. Now, let's understand what do we mean by event. I told you, no, transaction and events are to be recorded. That's what we discussed in the definition. So what do we record in accounting? Transactions and events. You understood transactions in detail. What do you mean by event? Events are results of transaction. Whenever 2, 3 transactions happen, as a result of it, something that happens is event. You purchase goods, you sell goods. You purchase goods, you sell goods. You purchase goods, you sell goods. You make profit. Event. Profit is an event. You purchase goods for 10,000, you sold it for 12,000. 2,000 profit. Event. What is the 2,000 profit? Event. I hope you got it. That's the reason you write that purchase on debit side, sale on the credit side, find net profit or gross profit as balancing figure. There is journal entry for transaction. There is no journal entry for event. Have you ever written gross profit account, net profit account? No, because it's an event. Result of a transaction is event. Another example, you purchased units which are 10,000. You sold 8,000 of those units. You bought 10,000 units. You sold 8,000 units. You are left with 2,000 units. Closing stock, that's an event. When you write closing stock in your trading account on the credit side, you write closing stock account. No, you don't. That is because again it's a result of a transaction which is an event. I hope you could understand the difference between transaction and event. Transaction is an economic happening. Event is result of a transaction. I hope you got it. Then we usually go through the story of who's the father of accounting. Luca di Pacioli, uncle photo sariyagi nodkonbidi. I don't know if you've seen Gogaya tara kanastare, but it's not Halloween. Yeah, Italian mathematician and sadness. Mathematician found accounts. Luca di Pacioli, the book he wrote is called as Summa the Arithmetica Geometrica Proportionati et Proportionalita. You would not get that question in the exam. You don't have to write, just showing off my knowledge. And Chanakya or Kautilya, who was the guru of King Chandragupta Maurya, in his book Arthashastra, he had written about accounts way before this. Again, for you to just know, saying that I know, nowhere required in our syllabus or exam anyway. Now, going further, how do we approach accounts? There are two classically universally accepted approaches. One approach that we follow in class. So, universally accepted approaches are two. One, US approach. Second one is UK approach. UK approach is called as the traditional approach or historical approach, or also called as English approach. And we have US approach, American approach, or what's also called as the modern approach. But what we follow here is for the love of the place that I come from, Bangalore approach. People who are watching it later on YouTube, please tell me the name of the city that you come from. I will reply to that by saying that I love Bangalore. Yes. Yeah, show your love towards your city. Tell me where are you from. Then let's get back. Bangalore. So the Bangalore approach is because like this helps us understand accounts so easily. It keeps entire accounts at the end of our fingertips. Start with Bangalore approach. That's by the way the Karnataka flag. No offense to people watching. That's why we are the first state across the country to have our own flag. Let's see. So if you make a fist and then like bang, we call it bang, and then like after that, because you bang so hard, your hands are your knuckles are hurting, and you open them up, and then each of the finger takes the remaining letters in the word Bangalore. Bangalore. This fulfills the entire accounting terms that we use across in all the chapters together. A in this stands for assets, L for liability, O for owner's equity, R for revenue, and E for expense. And going further, we're gonna, this is actually cheap version of US approach only, but yeah, we cannot call it copy, you can call it inspiration. So inspired by US approach, I've devised my own method of accounting called as the Bangalore approach, where this is bank, this is ALORE. Okay, A. E. This A and E, if it increases, it's called as debit. And if this A and E decreases, we call it credit. Asset and expense, increase debit, asset and expense, decrease credit. And the remaining fingers are these. What are they? L, O, R. L, liability. O, owner's equity. R, revenue. If this LOR is decreasing, we call it debit. If it is increasing, we call it credit. So, assets, liability, owner's equity, revenue, expense. Asset and expense, increase debit, asset and expense, decrease credit. Liability, owner's equity, revenue. Increase credit, decrease debit. Entire accounts at your fingertips. I'll go further to explain something more to you. This is asset, this is liability, this is owner's equity, this is balance sheet. Assets one side, liabilities and owner's equity one side. So if in case in the examination you have to pass a sign to your friend, what does this mean? Balance sheet. And then you tell like this, balance sheet torsu, show me the balance sheet. What if you want your friend to show P&L? Assets, liabilities, owner's equity, revenue, and expense. Revenue, P&L account credit side, expense, P&L account debit side. This is P&L. And this little what you see, no revenue more than expense. Positive thing in life, net profit. Revenue is more, expense is less. So you should think positive in life always. You'll make profit. And if in case you show the entire hand together, what does it mean? Financial statements, balance sheet and P&L together. So what is this? Balance sheet and P&L, financial statements together. An important hand sign for you all to remember. So balance sheet, P&L, financial statements. What does this mean? Bring balance sheet and P&L. Hey, come on, yeah. Now, under the UK approach, what do? We call it golden rules of accounting. We have three golden rules. One is for real account, second is for nominal account, third is for personal account. For real account, we say debit what comes in, credit what goes up. Nominal account, we say debit all expense and losses, credit all incomes and gains. Personal account, we say debit the receiver of benefit, credit the giver of benefit. Don't stop in between. Debit the receiver, credit the giver. No, it is debit the receiver of benefit, credit the giver of benefit. After this, types of accounts. How many types of accounts do we have? Wrong answers only 3. Correct answer is 2. There are 2 types of accounts. One is impersonal account, second one is personal account. You are able to tell 2, I believe you. Now, personal accounts are further classified into 3: real personal, artificial personal, and representative personal. Real personal are the people who are real, who have skin, blood, bone. I am a real person. Real personal account. You are a real person. Real personal account. Are you getting it? Then what is artificial person? They don't have skin, blood, bone. For example, a partnership firm. It is made of partnership deed. A company, it's made of articles and memorandum. It does not have skin, blood, bone, but it is still a person in the eyes of law. That's an artificial person. A bank is an artificial person. A cooperative society, a joint venture, a trade union, a student association, a college, a school, everything. All of these are artificial persons. They're not persons created by God. They're the persons that we created, meaning created by law. Created by law. I hope you understood. I'm sad. The moment I am telling you, really, some people like, oh, like, I didn't give that expression. You're making it now little to nonsense. What do you mean by representative personal accounts? This represents another real person or an artificial person. Now, I have an employee, is a real person. To him, I did not give salary. Standing outside, asking me to pay salary. Outstanding salary. What type of account is it? Representative personal account. Outstanding salary account is representing a real person who's my employee. There's a creditor, another company, who's my supplier. To this supplier, I have not given money. Now, creditor, if he is a person, real person account. If it is a partnership firm, they roll together and then they supply goods or they sell goods together, partnership firm, or they want company. So this company, they want to do business at a high level. That's a company and they supply goods to me. I buy goods from them. So they become my creditor, and that creditor is a real person or an artificial person? Artificial person. And if I owe them money for some interest, outstanding interest or something, that outstanding interest is representing a real or an artificial person. That becomes my representative personal account. Representative personal account represents a real person or represents an artificial person. Talking about impersonal accounts. Impersonal accounts are only 2. Your favorite, real and nominal. Real account talks about assets. Nominal account talks about expenses and incomes. What type of account is bank account? Real. Very good. Congratulations. Wrong answer. I knew it. This is common misconception. Bank is an artificial personal account. You get it? Prepaid expense. Asset account. Real account. No. Prepaid expense is representative personal account. So the conclusion is real account includes assets. Not all assets are real accounts. Real accounts includes, not all assets are real accounts. You get it? Yeah. So prepaid expenses, outstanding expenses, all of them are representative personal account. Bank is an asset if you have positive bank balance, but bank is a separate person. You write him as an artificial personal account. I hope you understood the common wrong answers. Real accounts. What does it deal with? Accounts that deal with assets, both tangible, what you can touch, and what you cannot touch, intangible. Nominal accounts, expenses and incomes. And personal accounts, basically 3 categories. No? Real person. Give me example. Modi account, Rahul Gandhi account, friends, your name and your friend's name. And artificial personal account, bank account, or cooperative society account, partnership firm account, company account, all of this. Representative personal accounts, prepaid expense, outstanding salary, advance given, all of these are representative personal accounts. Don't take all of these lightly, because if there is a very complex question on complex question on Garner versus Murray, or a very complex question in redemption of debentures, or a very complicated question in NPO, and you get the answer wrong, it's okay. Difficult question, so many of them would have got wrong. If they give something basic like this for 4 marks, and if you write that wrong, the evaluator will be like, Hachi, real person account only he doesn't know. Then what will he answer the rest of the paper? Then he will call his friends, hey, come here, come here, come here, and then show the answer. And all of them will be like, hey, they'll laugh together. They'll make reels of your answer paper. Don't give them an opportunity. Okay. Then US or American approach. Here the all items are classified into 5 categories: assets, liabilities, capital, expense, income. Or assets, expense, capital, liability, income. Asset and expense one side, capital, liability and income one side. Asset and expense, when it increases we debit. Liability, capital and income, when it increases we credit. Asset and expense, when it decreases we credit. Capital, liability and income, when it decreases we debit. So improvised version of this US or American approach is our Bangalore approach. I am clarifying this because later in the YouTube comments people will tell, okay, a cheap copy, copy ಮಾಡ್ಬಿಟ್ಟು ಅಣ್ಣ ನೋಡಿ ಹೆಂಗೆಲ್ಲ ಶೋಕಿ ಮಾಡ್ತವನೆ. Don't scold me in comments. Okay, just clarifying. Yeah, honest sir, ಒಪ್ಕೊಳ್ತೀವಿ ತಪ್ಪು ಮಾಡಿದ್ರೆ. Won't tell that ಇದು ಶರ್ಟ್ ಇದೆ, this shirt is there, this is 70,000 rupees. No, kidding. Joke. Okay, so we'll understand the meaning of the words that we use often. Number one, assets. What do you mean by asset? Asset is a resource. Asset is a resource. This resource is controlled by the entity. You don't have to have ownership. You don't have to have ownership. You need to have control. I have an asset, but I don't have control. It's not my asset. It's somebody else's asset. You got it? Because somebody else has control. I'll be crying in the corner. So I'm talking about concept. Yeah, you have an asset, you have control over it, and then using this asset, you can generate future economic benefit. And in the past, you've done some activity because of which you got this asset. What's wrong with all of you? So asset is a resource controlled by the entity, arising because of a past event and giving you future economic benefit. It's an asset. This I can write in a statement, but it doesn't sound so funny when you write it like that. So for better remembrance, remember asset is a resource controlled by the entity arising from the past event, giving us future economic benefit. Further, these assets can be classified into 2 types. What are the 2 types? One, current asset, non-current asset. Very good. What do you mean by non-current asset? What do you mean by current asset? How do you decide whether an asset is current or not? Simple sir, touch ಮಾಡಿ ನೋಡಿ. Shock ಹೊಡೆದ್ರೆ current asset. Shock ಹೊಡೆದಿಲ್ಲ ಅಂದ್ರೆ non-current asset. Life is not Rajmouli's Magadira movie. Not everyone whom you touch, I want that spark. When I touch, I didn't get that shock, so I won't marry her. Then you will remain single only. Me single. No, don't expect that spark and all to come. Spark will happen here. Okay. Tell me, how do you decide whether it is current or non-current? More than 12 months. Very good. Then less than 12 months? Current. More than 12 months? So basically what you're telling me is whenever I buy one asset, I will tell, okay, current or non-current? ಹೇಳ್ತೀನಿ. I'll use it for 12 months. In 12 months, it died. Current asset. After 12 months, it's still there. Hey, non-current asset. Will you wait for first year birthday? Hey, how can you say first year birthday admile it's non-current, till first year birthday it is current? No, that's not right to say. You decide whether an asset is current or non-current based on the operating cycle. Hearing it for the first time? Yes, it's called operating cycle. What do you mean by operating cycle? From the time you buy the raw material till the time you collect the goods on sale, time is called as operating cycle. To buy the raw material, I take 3 months time. After I place the order to receive it. Manufacturing finished goods, I take 3 more months time. To sell it, I'll take 3 more months time. For my customer to give money, it will take 3 more months time. It became 12. What if from the time I buy raw material till the time I sell the goods and collect money, it will take 11 months. Then my operating cycle is 11. What if from the time I buy raw material till the time I collect goods from my customer, I'll take 15 months. My operating cycle is 15 months. So if the benefit of an asset gets expired within operating cycle, subject to minimum of 12 months, we'll call it current. If the useful life of that asset goes beyond the operating cycle, then it is non-current. 12 months is minimum condition, not the only condition. What if my operating cycle is 18 months? Then 12 months you put to dustbin. What you should remember is 18 months. There is one asset which will expire in 16 months, current. There's an asset which will expire in 17 months, current. There's an asset which will expire in 18 months, current. The asset's useful life will go beyond 18 months, non-current. So what is the criteria? Operating cycle subject to minimum 12 months. What if my operating cycle is 4 months? Don't consider 4, consider 12. Consider 12. Are you getting it? In your language, if I have to tell, take 12 months or operating cycle, whichever is high. I know you like it like this, no? When I told it with that language of the standard language of the accounts, you did not understand. Take 12 months or operating cycle, whichever is high. I know how you roll. I mean, say how you understand. You understand only when I tell whichever is higher and all of that. Okay. So that's the basis how we decide whether an item is current or non-current. See, what do you mean by operating cycle? Time between purchase of raw material to sale of finished goods and collection of money from customer, subject to minimum of 12 months. In your language, operating cycle or 12 months, whichever is high. Then this fixed assets will be further classified into two categories: tangible, intangible. What do you mean by tangible? What do you mean by intangible? If it has physical existence, you can touch, you can see, you can feel, then what is it? Tangible asset. You cannot touch, you cannot see, you cannot feel, then it is intangible asset. Give me example of tangible asset. Land, building, plant, machine. Machine is tangible, intangible? Tangible. But when you're touching, just ensure that the machine is off. Because if you keep the machine on and then keep your hand, that might be the last time you touch something. You get it? Or if it is really hot, gone. So physical existence exists, tangible. Physical existence doesn't exist, intangible. Give me example of intangible asset. Patent, trademark, copyright, license. Don't tell goodwill, please. Goodwill will discuss in detail. Goodwill is not the good example. Please don't tell goodwill. Brand, trademark, copyright, license, all of these are your intangible assets. You got it? See, this classification of tangible, intangible is there only for non-current or fixed assets. It's not there for current assets. Give me example of current assets. Trade receivables, inventory, cash, bank. There you don't classify. Why? Anyways, it's there only for short period. There, what tangible, not tangible. Just write current assets. You can't go to your sundry debtor and then say, can I touch? I want to know whether you are tangible. No. If you touch, they will touch. So just write it as current asset. I hope you understood the definition of asset. Yes, sir. Next, after asset, liability. What is liability? It's an obligation. It's a present obligation. It's an obligation which is present. Today you are obligated. Why? In the past you did something. So present obligation arising because of a past event. And because of this present obligation, today you are obligated to do something because you did something in the past. In the future it will result in outflow of cash. In the future you might have to pay cash. So in one sentence there are three tenses: past tense, present tense and future tense. In asset also all three was there. Arising because of a past event, going to give us future economic benefit. In the past you purchased, in the future it will give you benefit. Today it is asset. Liability, in the past you have taken some benefit, so in the future you have to make payment. Today it is liability. In the past you have taken benefit, in the future you should make payment. Today it is liability. In the past you have purchased, in the future it will give benefit. Today it is, so you are in the present. You getting when is it asset, when is it liability? So liability is a present obligation arising from past event, which will result in outflow of resources, money or money's worth. Sometime you give money, sometime you give something which is worth money. Understood this? Then let's go to the next concept. Before that, types of liability: current, non-current. Again, same thing, yeah. Based on operating cycle, subject to minimum of 12 months. Going to the next one, owner's equity. What does owner's equity include? Two things: capital and reserves. Owner's equity basically represents what belongs to the owner. What belongs to the owner is what he has given, plus what the firm has earned, which should be given back to him. He gave initial capital of 1 lakh, owner's equity. He gave additional capital of 50,000, owner's equity. He withdrew 20,000. Out of 1 lakh 50, 20 is already taken. 1 lakh 30 is his capital. He earned profit of 20. Add that 20. So owner's equity is found as opening capital plus amount invested, additional capital, totally amount invested minus money which is already withdrawn plus the profit that he earns during the year. Totally we call it owner's equity. So owner's equity is amount invested minus amount withdrawn plus profit belonging to the partner will give us owner's equity. In short, it is called as capital plus reserves. Capital plus, if is already withdrawn something, that will be deducted. I hope you understood owner's equity. Next one, revenue. What do you mean by revenue? Ring finger. Revenue. Revenue is value of all the goods that you sold or the services that you have given. It is value of all the goods sold or services given to another person together. It's called as revenue. If you sell goods, revenue. If you give service, revenue. Then comes our expense. Expense is opposite of revenue. What is expense? It is value of goods purchased or value of services taken. It is value of goods bought or services taken by the entity. As an entity, if you buy goods or if you take services, that is called as expense. I hope you understood ALORE. We're good with the basics. We've understood what exactly is the approach that we should follow for accounting. Going further, why exactly do we do accounting? Objectives of accounting, functions of accounting, limitations of accounting. Every chapter will definitely give you 1-2 summary questions or 1-2 short note questions. If you observe the past examination pattern, 4 marks definitely is there on your short notes. Sometimes it's there up to 8 to 10 marks also. All that you need to do is whenever you are free, bored of studying for the next 15-20 days, in every chapter you identify 3-4 short note questions. Every chapter, 11 chapters. If you identify 3, you will come across 30 short notes questions. All 30 you write it in one paper. Read it just the day before the examination when you are bored. So if in case you do that, any big question, if you are not able to solve, if it has a very tricky adjustment, this question what you can write will be a savior. You can easily guess all the questions that will come in your short note questions, because every chapter the possibility is 2-3. Some topics, first 2 chapters, I think you can guess up to 6-7 short note questions, but in some chapters you won't get any short note questions. Possibility is almost 0. So put all of them together, write them down and then read, and that will ensure that 4 marks to 10 marks whatever short notes will come in last question, you'll be able to ace it. That's not our primary focus to write. We'll be aiming to write the problematic ones only. But if we get stuck, if it comes to be a very good question, very new question, what you never expected, that will be saved by that last short notes question. You can at least rely upon that. Okay. Then objectives of accounting. What are the objectives of accounting? Number 1, systematic record of transaction, to rekeep everything in recording. Second one is ascertaining financial performance, to know what is the profitability. Third one, ascertaining financial position, to know our balance sheet position. 1, systematic record. 2, financial performance. 3, financial position. 4, decision making. In order to take decision, you need timely information that's given by financial statements. Last one, to know solvency position. At any point of time, if you close your business, if you sell all your assets, will you be able to pay all your liabilities? If you can pay all your liabilities, you are solvent. If you cannot pay all your liabilities, you are not solvent, insolvent. To know it, you should do balance sheet and PL. I hope you got it. What are the functions of accounting? When someone asks how much profit did you tell, you cannot tell this much, this much. It's to be measured in terms of money. So accounts helps you measure things. Next one, forecasting. When you have to borrow money from somebody, when you have to go for IPO, when you have to do all of these things, you need to forecast how much profit will you make next year, how much will be your value and net worth next year. You need to forecast, predict the future. You will predict the future based on your present. In 4 years, you'll have 1 crore rupees bank balance. How do you predict? Today you're doing CA course. In 3 years, you'll finish the course. In 1 year, you'll earn 1 crore rupees. It's a dream, but yeah. So that forecast is possible based on the present. And decision making. So in order to take decision, you need the data, no? So decision making is a very important function of accounting based on the information available in accounting. Comparison. In order to compare 2 businesses and tell which one is doing better than the other, or leave comparing with others. In order to compare your own previous year with your own current year. After comparison, you will do evaluation. This is better. That is better. That comparison and evaluation is a function possible because of accounts. And control. You can have control over your business only by looking at accounts. After you looked at your accounts, you understood you've been making loss for last 3 years. Then you'll take control of things. You'll increase your selling price. You'll decrease your expense. Do something. That's possible only because you saw the accounts, no? Accounts will tell you whether do you have control over your business or you don't have control. And lastly, government wants you to maintain accounts. For all companies, MCA filing has to be done, annual returns filing every year. And for non-corporates, it's not so strict, but you still have to maintain. At least under Income Tax Act, you need to disclose your books of accounts. So maintaining accounts is a part of government regulation by way of taxation or otherwise by way of taxation also. Understood the function part? Then limitations. Accounts is only record of quantitative factors. Qualitative factors, we don't care. And it's a record of historical information. What happened long, long ago will record now, not what's happening today. It doesn't care about price level changes. If the price of the product has changed after you bought, it will never keep in track of that change. It will only keep in track the old price. And biased accounts is different for different people. You can follow a different method. I can follow a different method. Arrive at two different profits, though we did same amount of sales. So it is biased. And the last point is window dressing. Accounts can be used as a tool to make a very bad looking company look really, really nice. There's one company called Ship Company, which really launched IPO. And there's one more company who sells something that you wear. They also launched it. I won't take their names because I don't want to be under any trouble. So when they launch now, whenever they're going for IPO, they want people to think that they're making a lot of profits. They're thinking that they can hide everything. Last 3 years they made loss. Suddenly they went for IPO. In that year they made profit. How did they have profit that year? Very simple. They sold a lot of their investments, realized the profits, and made it look like that is normal profit. That's not the profit that they got because of sale of. That's the profit that they got because of sale of investment. Unrealized gains they realized made us to look profitable. So last 3 years loss. This year profit. What do we think? Hey, good, yeah, good company, lot of profit. No, fabricated to make it look good. So accounts is something that can be used to make things look good. Inside it's not good, but by the window, from the window, it will look really, really nice. ಏನಿಲ್ಲ ಒಂದಷ್ಟು ಫೌಂಡೇಶನ್ ಕ್ರೀಮ್ ಎಲ್ಲ ಹಾಕ್ಬಿಟ್ಟು ಒಳ್ಳೆ ಮೇಕಪ್ ಮಾಡಿ ವಿ ಕ್ಯಾನ್ ಮೇಕ್ ಇಟ್ ಲುಕ್ ರಿಯಲಿ ನೈಸ್. ಆಮೇಲೆ ಹೋಗಿ ಫೇಸ್ ವಾಶ್ ಮಾಡಿದ್ಮೇಲೆ ಗೊತ್ತಾಗುತ್ತೆ ರಿಯಾಲಿಟಿ. So you understood? Window dressing is something which is very obviously possible. And then we have one last thing. This has been asked a couple of times in the exam. What is the role of a chartered accountant in the society? What can you do once you qualify as the chartered accountant? You can give your contribution to the country in several sectors. One, in the field of service, you can do a lot of work like helping people maintain their books. You can help them in audit, both statutory and internal. You can help people in taxation. You can help them in financial planning and advisory. You can become a consultant who will give management accounting and consulting services. You can help people incorporate their company in incorporation, liquidation, secretarial compliance, and you can help them in arbitration, that is out of the court settlement. These are all the services what a chartered accountant can offer. Previously, when the question was asked on this topic, a lot of them very beautifully wrote wrong answer. See, when they ask what is the role of a chartered accountant in the society, you can write service, industry, PSU, fiscal development of the country, economical growth of the country, entrepreneurship, everything. When they specifically ask what are the services what a chartered accountant can offer, you should write only these. Are you getting it? This is service, sub answer. Instead of going into service, instead of opening your own angadi, your own office after passing the exam, you can also get into industry. When you get into industry, you get into employment. You can work in accounts department, budgeting department, finance department. You can help them in costing decisions. You can also help them in treasury, money management. This is the departments in which you can work once you become a chartered accountant. You can get into PSUs, public sector undertaking, like your HAL, BHEL, BEML, all of this. In these also you can work in finance department, budgetary department, accounting department, auditing department, reporting department. If you don't have to work, if you don't have to give service, what can you do? You can become an entrepreneur. Entrepreneur and businessman. Or you can contribute to framing fiscal policy. Nirmala ma'am comes with one budget every February. There are a lot of people behind who do the entire working. As of date, when we're recording this video, Nirmala Sitharaman Madam is the finance minister. If you are watching on a date where somebody else is finance minister, do tell me. Yeah. Why is it not possible? Yeah. So what if someone does time travel to the back time and then watch it when Pranab Mukherjee was there? Manmohan Singh. Not possible? Possible. Fine. So in forming the fiscal policy also you can help. You can become part of Siddaramaiah team. I don't. As of today, Siddaramaiah uncle is the chief minister of Karnataka. When you're watching it, if DK Shivakumar uncle is the chief minister, type congratulations DK Shi in the comments. So if in case you become part of that finance committee or finance advisory to the chief minister or to the finance minister, you can also help them frame their budget. You can also work along with government. You understood? Then last one I told, no, entrepreneur. You can become entrepreneur by contributing to economic growth. Entrepreneur andre business. You can do business. You understood? So this is the introduction part. Let's discuss accounting concepts and conventions now. To begin with, what do you mean by an accounting concept? When you're sitting quietly and then thinking about accounts, you got one idea. Idea, fine. We'll put the switch. Okay, you got an idea. And this idea is not some dabba idea of yours, okay? This idea will be accepted universally. Universe means? Yeah, whole world. Everyone in the world. Yeah, and this will be universally accepted in preparation of our financial statements. It's not like idea in the field of science, it's an idea in the field of commerce. So it's an idea which has universal application, which is fundamentally assumed in the preparation of our financial statements. That becomes accounting concept. So what is accounting concept? It is an idea which has universal application. It defines the assumptions based on which financial statements are prepared. So you need to remember three things when you basically you're doing bulb on like this. Okay, there are three images that should come in your mind. One, bulb. Two, globe. Three, paper. If you remember these three, answer is done. What are the three images? One, bulb. Two, globe. Three. Okay. What is it? It's an idea. Everyone, use your hand. It's an which has universal application. It is the assumptions based on which financial statements are prepared. Read it. Idea having universal application based on which financial statements are prepared. These are accounting concepts. How many accounting concepts do we have? We have 10 of them. Don't assume concepts with conventions. Assuming concept as a convention is a big mistake. Please don't do it. So 10 of them. All 10 on the board. Let's start with the first one. Let's start with the 6. Intent. Abhishek Sharma. First ball in the full intent. 6 on the first ball. Kagiswar Abada crying in the corner. Going concern concept. What does going concern concept say? I want active participation. The organization is going to stay here. It's not going to be wound up very soon. To the extent I can see the future, I can see myself scoring centuries. That's going concern concept. What does it say? An organization neither has an intention nor a necessity to close down its operations in the near future. Important for short notes questions as well as true or false. Use the same language, take 2 marks and go. Write your own language, come again next time. Understood? So what is going concern concept? After me. Okay, an organization. Everybody with hands. Everybody. Everybody includes everybody. Everybody with hands. It's cut off. After me. An organization. Should not do before me. After me. An organization. Neither has an intention nor a necessity to close down its operations in the near future. Going concern concept. Remember this. Till the time the going concern concept is there, assets in the financial statements are recorded at historical cost. Got it? Very important fundamental accounting assumption. Whether you tell or not, we'll assume that going concern concept is there. If going concern concept is not there, then you should tell, actually, my business going concern illa. You should tell. If you don't tell, what is the assumption? You are a going concern. You are a going concern. Understood? Next, let's go to entity concept. Now we'll come back to one. First ball we hit a 6. We'll give single and faster strike to Shubman Gill. So, sorry. We'll go for 3 runs. Oh my god, 3 runs. Periodicity concept. What does periodicity concept say? See, business is quite long. We're going to continue for quite long. I agree. But the big business have to be broken into small parts. And we need to prepare financial statement for each small part of the business. That one small part of the business is called as accounting year. If someone asks me for financial statements, say, hey, no, I'm going to do business for 20 years. After 20 years, I'll prepare 20 years together P&L. What if you're doing loss from first year? By the time you came to 6th year, loss became so huge that your capital became zero and business wound up. Would have taken different decision if you would have known on year 1 that you are making loss, no? So you should know it at the end of year 1. So what do? follow periodicity concept. What does periodicity concept say? It says that entire life of the business will be divided into small portions called as accounting period, and financial statements are prepared for each accounting period. Look at this and you'll say it after me. Okay? Entire life of the business. People you're watching at home, you also should do this. It's okay, people at home might judge you. What are you doing like this, and all? You do it. Okay. Entire life of the business is divided into small portions called as accounting period. Financial statements are prepared for each accounting period. See, this is balance sheet, this is P&L, this is financial statements. This is entire life. This is accounting period. Each period you prepare financial statements. You understand? What is this? What is this? Periodicity concept. You know how to teach your friend in the exam. Yes. Okay, this periodicity concept is also called as accounting period concept. It ensures that there is uniformity. I also prepare April to March. You also prepare April to March. Uniformity comes because of periodicity concept. Then let's go to next one. Next one is entity concept. Entity concept says that an organization and its owner are two different people. They're not the same. An organization is distinct from its owner. This is organization. This is owner. Organization is distinct from its owner. Observe this. Business entity is distinct from its owner. Business affairs are different from personal affairs. You get this? Business partner is different from life partner. You get this? For example, capital that you keep in the business, it's liability to the business, but it is asset to the owner. I have given money to my business. At the end, my company should give that money back to me. So to me, it's an asset from my perspective. From the business perspective, it's a liability. I hope you got it. So help me with this. A business entity is distinct from its owner. Do it after me. Business entity is distinct from its owner. Business affairs are different from personal affairs. Very good. Same capital, which is a liability to business, is an asset to the owner. Entity concept done. Small thought for you to think is entity concept and separate legal entity, what you learn in company accounts, same. No, they are different. Separate legal entity is applicable only for company. Business entity concept is applicable for all. Separate legal entity says that ownership and management is different. Here it says business and owner is different. There's a difference. It's not the same. Don't misunderstand. Okay. Let's go to money measurement concept. What do you mean by money measurement concept? Money measurement concept says that anything and everything, if you have to record in books of accounts, it has to be measured in terms of money. If it cannot be measured in terms of money, it has no place in accounts. So to record transactions in books of accounts, it should be measured in terms of money. So I'll tell you first and then you'll follow. Transactions to be recorded in books of accounts, it should be measured in terms of. If you cannot measure in terms of money, you cannot record it in books of accounts. You got it? Anything, expense, income, asset, liability. Sir, my friend is my asset. Mansal it balance sheet alalla. You can keep them in your heart. You can't write. If you have to write him in your balance sheet, you need to tell one value. Tell ಎಷ್ಟು friend value, 10,000 rupees. ಕೊಟ್ರೆ ಮಾರ್ಬಿಡ್ತೀರಾ? No, you can't value certain things in terms of money. You cannot write them in balance sheet because of that reason. I hope you got it. Yeah, come on, help me. Now you do it after me. Transactions. Why is this transaction? You receive something, you give something, you receive something. That is transaction. Not this. One hand back, one hand front. One hand back, one hand like chum, 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 like that. Okay. Barsore mega mega. Done. Transactions to be recorded in books of accounts should be measured in terms of money. Very good. If you cannot measure it in terms of money, you cannot write it. Why money? Because it's the medium of exchange which is universally accepted. You cannot write, no, I'll write it in kgs. You cannot write everything in kgs, no. You get it? You cannot write everything in liters. You cannot write everything in meters, centimeters. It's not like that. Some raw material you can tell 10 units. Cash, how can you tell 10 units? Not possible. Raw material you can tell 1000 kgs. You buy apple, you make apple juice and then sell. Raw material purchased is in kgs. Sales is in liters. Uniformity is not there. So universally accepted medium of exchange, which is of standard economic value, is money. I hope you got it. By this we finish money measurement concept. Then let's go to accrual concept. What does accrual concept say? Something very simple. It says record it when it happens. Don't wait for cash to affect. Yeah, it says record transactions as and when it happens and not merely when it is affected in cash. See this? Record transactions as and when it happens, not merely when it is affected in. Will you do it with me? Okay. Record transactions as and when it happens and not merely when affected in cash. Once more, okay? Record transactions as and when it happens and not merely when it is affected in cash. Very good. Accounting usually can be done on accrual basis, that is also called as mercantile, which means business basis. There is another method called as cash basis, usually not followed. Professionals or not for profit organization can choose to follow, can, not will, they can, but mandatory for all business entities to follow accrual concept. There are three things which are mandatory. One, going concern, we already discussed. Second one, accrual. Third one, consistency. It is a convention, we'll discuss separately. Got it? Cash basis, who can follow? Not for profit organizations and professionals can, not should. Then matching concept. What does matching concept say? Whenever you have to record some item, you need to match and then record. You cannot tell in the same year you made 10,000 profit as well as 8,000 loss. 10,000 is not profit, it's income. 8,000 is not loss, it's expense. To 10 minus 8, 2,000 as your profit. You cannot make profit and loss from the same transaction. You can either make profit or make loss. You need to match them to tell whether you made profit or you made loss. So what does matching concept say? It says that we need to match current year expense with current year income to arrive at current year profit or loss. Imagine a P&L account here. This is debit side. This is credit side. This is debit side. You are this side, yeah. I'm talking to you. This is debit side, no? This is credit side, no? Debit side you write expenses. Debit side you write expenses. Say something. Credit side you write income. If expense is more, income is less, loss. If income is more, expense is less, profit. That's what matching concept is. And you need to match this year income with this year expense. What if you match this year income with last year expense? What are you doing? This year expense with this year income will give you this year profit. So what does it say? It will tell we need to match current year revenue with current year expense to arrive at current year profit or current year loss. Yeah, help me with this. Yeah, I'll tell first. We need to match current year expenses with current year incomes to arrive at current year profit. Income is more, expense is less, profit or loss. And I raise this hand, you will also raise this hand. This hand, raise this hand. This hand. I am raising the side of the hand. This side your hand tigiri. Should I do like this? See. Okay. Everybody, focus. We need to match current year expenses with current year income to arrive at current year profit or current year loss. Once again, we need to match current year income, current year expenses with current year income to arrive at current year profit or current year loss. That's matching concept. This matching concept is based on two things. One, accrual, two, periodicity. How is it accrual? How is it periodicity? To make current year expense and current year income come, the business life should be cut into periods, no? So matching concept is possible because of periodicity. Without periodicity, no matching concept. Second one, this year expense should be written in this year. What if I pay this year expense in next year? Though I pay in next year, I'll still record it in this year because of accrual. So matching concept is based on periodicity and accrual. Matching concept is based on periodicity and very good. Then let's go to cost concept. What does cost concept say? It says record all the assets that you buy at the historical cost. What is historical cost? The amount that you paid when you initially bought the asset. The amount that you paid when you initially bought the asset. It says value of an asset is determined based on historical cost. Value of an asset is determined based on historical cost. Very good. What is historical cost? Long ago when you purchased, whatever you paid is historical cost. Understood? Till the time an entity is going concern, we follow historical cost. When the entity is no longer a going concern, we will follow realization concept. Realizable value to record it. We'll discuss it later in the same chapter as valuation principle. Understood? I told you no. An entity is going concern, historical cost. What if entity is not a going concern? Realizable value. Realization concept. This is no longer there in your study material, but we'll still discuss one. What does it say? This says that record it not at the price at which you purchased, but at the price at which you can sell. At the price at which you can sell. Assets will be recorded at realizable value. So this is followed only when there is no going concern. Started like that. Now the recent amendment in Accounting Standard 10, the new Accounting Standard 10, allows us to record the asset under revaluation concept. That revaluation concept is basically very close to our realization concept. Are you getting it? Knowing this much is sufficient. Then let's go to the next one, which is dual aspect concept. Dual aspect concept says that revenue recognition will discuss separately. Leave that. You need to recognize the revenue when three things are transferred: risk, reward, effective control. Then come to dual aspect concept. What does it say? It says that every debit will have equal credit. That accounting equation, assets is equal to liabilities plus capital, because of this only. It says that every transaction that you do will have two aspects. Every transaction that you do will have, you need to recognize, measure, and record both aspects. Every transaction will have how many aspects? We need to recognize, measure, and record both the aspects. See, recognize, measure, record both the aspects. That is the reason we get this accounting equation, which is assets is equal to liabilities plus. Fantastic. We will not waste time on this, but you know that increase in one asset will lead to decrease in another asset or increase in liability. Increase in one liability, examples bedala. Decrease in an asset will result in increase in another asset or decrease in liability. How about increase in a liability? Will lead to decrease in another liability or increase in asset. So these are the all possibilities. I hope you people are aware and I don't have to give you example to understand. Is it safe for me to assume that? Cool. Last one, objective evidence. It says that whenever you want to record a transaction, you should have some evidence backing it. So every transaction to be recorded in books of accounts, it should be backed by an evidence. It should be some invoice, some voucher. Only then it can be presumed that the transaction actually existed. If not, what if you fake a transaction and then record? So objective evidence is that every transaction is to be supported by an evidence proving its objective. Let's go to the next one. The next one is accounting conventions. Accounting conventions, what are conventions? Concepts are ideas universally accepted based on which financial statements are prepared. Conventions are what which will arise in the ordinary course of accounting. Initially, conventions will not be there. Concepts are the pillars, concepts are the foundations. Using the concept, you started doing accounting. But certain instances, whenever you found something new, that became a convention. You get this legacy. Over a period of time, what became convention. So, by emerging out of accounting practices, we call them conventions. These are derived by usage and practice. What are accounting conventions? Which emerges out of accounting practices. These are derived by usage and practice. How many accounting conventions do we have? We have 4 of them. What are they? Conservatism, consistency, materiality, and full disclosure. Let's start with conservatism. What does conservatism say? It says you need to account for all expected expenses and losses, but not for expected incomes and gains. It says account for all expected expenses and losses, but not for expected incomes and gains. Yeah, will you do it after me? Account for all expected expenses and losses, but not for expected incomes and gains. Once more, account for all expected expenses and losses, but not for expected incomes and gains. Understood? So, if you expect some loss in the future, record it today. If you expect some income in the future, wait for that day. This will basically result in understatement of income and understatement of wealth. But we should not use this to do window dressing. We should use this to show the prudent value of the assets. We should do it not in a way which is not neutral. Should stay neutral. It should be prudent and practical. You should be having an intention of showing faithful representation of accounts. This year you have 20 lakh rupees profit. You don't want to pay income tax. What do? Create provision for bad debts, 18 lakh. Reduce the profit from 20 lakhs to 2 lakhs. Pay tax only on. Is that right? No. It should be with an intention to show faithful representation. However, Income Tax Act doesn't let you do provision for bad debts. It will only tell that actual is there, right? If it is not actual, no provision allowed. Anyways, if you want to show more profits and all, will you do less provision? You should not use conservatism to your advantage. Conservatism should be applied neutrally. It should be applied practically. It should be applied with an intention of giving true picture of financial statements to the user. I hope you got it. Say something. After conservatism, we have consistency. What is consistency? This is a fundamental accounting assumption. I told you there are three fundamental accounting assumptions. Number one, going concern. Number two, accrual. Number three, consistency. What do you mean by consistency? Consistency says that we need to apply same accounting policies and practices from year to year. You can't keep changing them. You can't tell last year I'll follow A, this year I'll follow B, next year I'll follow A, in the third, fourth year I'll follow C. No. Accounting policies and principles followed by an entity should be consistent from one accounting period to another. This is policies. This is principles. What is this? What is this? What is this? Asset, expense, liability, owner's equity, revenue. If I show like this, revenue. If I show like this, policies. This, policies and principles. Okay. Accounting policies and accounting principles should be consistent from one accounting period to another accounting period. Okay. What does it say? Accounting policies. Everybody. Accounting policies and accounting principles should be consistent from one accounting year to another accounting year. This is consistency. It's a fundamental accounting assumption. Remember, there are three fundamental accounting assumptions. One, going concern. Two, accrual. Three, consistency. Consistency will enable comparability. If you follow same principles last year, same principles this year, you can compare two balance sheets. Last year you followed different methods. This year you're following different methods. You cannot compare two balance sheets. To compare them, policies have to be consistent. Understood this? Can we ever change our accounting policies? Yes, there is a possibility. We'll discuss it under Accounting Standard 1, disclosure of accounting policies, slightly later. Come on, let's go to the next one. So, periodicity, consistency are connected. Then, going back to the next one. Materiality. What's materiality? Not everything will make you cry. Some things will make you cry. What will make you cry? Tell everyone that it made you cry. It's very important to you. If you hurt me in this part, I'll cry. So that's the same thing. In a financial statement, we need to disclose not everything, but those things which are very, very material. If a cashier steals 10 rupees, that's not a big deal. But if a cashier steals 10 lakh rupees, that's a big deal. Disclose it separately. It's a separate line item. Don't write it in profit and loss account in other expenses inside one item, cash stolen by cashier 10 rupees. Okay. But cash stolen by cashier 10 lakh, don't write in one heading, under that subheading, in under that subheading. No, show it on the face of the financial statements. So materiality says that items which affect decision making are called material. Items which affect decision making are material. Material items should be disclosed on the face of the financial statements. All facts and figures which have significant economic importance are material, and items which are material should be disclosed openly. Are you getting it? Items which affect decision making are to be called material, and they're supposed to be disclosed openly. Read what is materiality. Facts and figures which have significant economic effect are all material items are to be disclosed. Understood? Got it? Affects the decision making of the user. Okay? There is a contradicting convention called as full disclosure, which says I don't care whether it is material or not, disclose everything. Full disclosure says disclose material items, disclose immaterial items also. Let them take the decision. Isn't it contradicting to what we discussed in materiality? Which one to follow? Follow both. Which one to follow? Follow both. How to follow both? Material items will be disclosed on the face of the financial statements. Immaterial items will be included in the working note, included in the notes. It will not be given on the face, but it will be included inside. Are you getting it? For example, that cashier stole that money. It's a very extraordinary item. Let's say huge amount is there. It is an exceptional item. What to do? You will write income, We'll write expense, income minus expense, profit before exceptional item. We'll write less, cash stolen by cashier, exceptional item, 10 lakh, loss. What if we stole only 10 rupees? Income minus expense. In expense, there is other expense. Inside other expenses, there is petty expense. Inside that petty expense, there is cash stolen by cashier, 10 rupees. You understand materiality, immateriality? Whether material or immaterial, include. If it is material, show on the page. Got it? That's full disclosure concept. By this, we finish all the accounting concepts and conventions. Materiality and full disclosure have actually contradiction between them. Which one to follow? Follow both. Follow both. There's a story that I tell in the regular class about a party where the tie is supposed to be wore, which you should not know now. So, going concern concept, accrual concept, and consistency. 3 green flags because these are considered as fundamental accounting assumptions. And we come to the end of another life. Okay, accounting concepts and conventions, another unit is done. Like the May Olagan movie, here we are bringing a cycle. Accounting cycle. So accounting cycle has several parts in it. So the stages are recording, classifying, summarizing, analyzing, interpretation, and communication. We read all of this in our definition. So we learn all of it together. To begin with, recording. Don't worry, you don't have to bend your head like this. I'll only. So when we talk about recording, it's an initial record of transaction. Initially, you record all the transactions, whatever happened in a book, that's called record. Basically, your journal or subsidiary books is called as recording. So it is all business transactions which are of financial character, which are evidenced by documents, are recorded here. Business transactions, we read in definition. Financial character, in the definition it was there. Evidenced by documents, objective evidence concept, they are recorded. What is to be recorded, you understood? Where to record? To record it in journal. Journal is derived from French word jour. Jour means day. So a book in which all daily transactions are recorded is day book, or also called as journal. In journal, you record all the transactions. Later classify them to ledger. Too much work. At the time of writing only, can I write different types of transactions in different books? Possible. This is done usually if the scale of the business is much big. This is called as special journal. What is it called as? Special journal is subsidiary. Special journal is fantastic. There are types of special journals or subsidiary books: sales book, sales return book, purchase return book, cash book, petty cash book, bills receivable book, bills payable book, lastly journal proper. These are the types of subsidiary books. In the second chapter, accounting process, we'll discuss them at large. Got it? Let's go. How to record these transactions? Very simple, yeah. Day-to-day basis, you would have to record. How to record, we'll learn in chapter 2, accounting process. The third aspect is when to record. I told you, no, day book. Day book means what? Daily basis. What ra Sudeep, you don't know that also. Whenever transactions happens, you need to record it in daily basis. This is recording. Once you record all the transactions, what should you do? You should classify them. You classify people you know as dushmans and then non-dushmans. Okay, ಇವರೆಲ್ಲ ನಮ್ಮ ದುಶ್ಮನ್ಗಳು. ಇವರೆಲ್ಲ ನಮ್ಮ ಹಿತೈಷಿಗಳು. Like that only. So we need to classify all the transactions into bad, good. No. Into the accounts involved. Yeah, all the accounts, all the journal entries where cash is involved, write it one place. All the journal entries where sales is involved, one place. All the transactions where debtors are involved, one place. This classification based on the account involved is called as ledger preparation, which is classifying. What is classifying? Grouping the transactions based on the account nature and type. And here what do we do? Ledger. Ledger is derived from a Dutch word leggen, which means to classify. And basically we classify. And how to prepare ledger? I told you, we learn in chapter 2. Then we come to when to prepare ledger. When do we prepare ledger? It is prepared periodically. It's your choice. You can do it daily, you can do it weekly, you can do it monthly, you can do it yearly. Your choice. But in a computerized accounting era, the moment you pass the journal entry, instantly it will go to ledger. Are you getting it? It's your choice. You can do monthly, weekly, quarterly also. But in a computerized environment, it will happen instantly. You just have to pass journal entry. It will automatically take it to ledger. Done with classifying. Then comes summarizing. In summarizing stage, what do we do? Already whatever journal is prepared, whatever is ledger is made, using that we prepare one summary. You kept one book, cash book, one book, sales book, one book, purchase book, one purchase return book, one sales return book, one bills receivable book, one bills payable book. So many books are there. Bank asks, How are you doing? Then you want to give everything in one place. So you prepare one single paper where the summary of everything there. That's summarizing. So in summarizing stage, we prepare financial statements. In order to prepare financial statements, we prepare trial balance. So after classifying, before summarizing comes trial balance. And once trial balance is done, we prepare financial statement. It's a short version of the long story. You might have seen movies. There's something called movies, 2.5, 3 hours. They show it in theater, Okay. That entire thing. Some people will put the full movie rusher and then make 1 minute reel. There's something called reel short. They'll put little part of that movie together and they'll explain full movie in 1 minute to spoil it for us. So that reel is there, that short is there. That is summary of the full movie. Yeah. So what is summarizing? Preparation and presentation of financial statements. You understood? For evaluating financial performance, P&L account. For evaluating financial position, balance sheet. Fantastic. Where to evaluate performance and position? To evaluate performance, we prepare trading, P&L, manufacturing. To evaluate financial position, we prepare balance sheet, cash flow statement. Where do we learn it? This manufacturing, trading, P&L will not learn in chapter 2. We learn it in final accounts of sole proprietor. And balance sheet also there. Cash flow statement in CA Inter. Morning we were taking CA Inter financial statements topic. Then how to prepare financial statements? I told you, we learn it in a separate chapter, not now. Then when to prepare? When to prepare? When to prepare? When the question is given. After summarizing. After? No, it is part of summarizing. It's not after. It is part of summarizing stage. People usually think end of the year, not necessarily at the end of the year. Whenever you want, you can prepare. If it is a listed entity, as per SEBI regulations, every quarter, after every, not just after end of full year. Like one full is how many quarters? Very good. One quarter is? 180 ml at 4 months. One quarter is 4 months. April, May, June, July, one quarter. August, September, October, November. Sorry, 3 months. April, May, June, one quarter. See, correct. 12 by 4, 3 months. April, May, June. Correct, no? The July, August, September. The 30 ml alappa, 3 months is one quarter. April, May, June, one quarter. July, August, September, one quarter. October, November, December, one quarter. January, February, March, one quarter. Every quarter, after go on the balance sheet P&L, they should prepare and then give. Mandatory, not optional. If you take loan from some banks, no huge amount. They will tell, I want MIS. Every month I want balance sheet and P&L. They will prepare monthly. If you take borrowing from some people, they'll ask monthly report. So mandatory at the end of the year. But because of additional requirements, you might have to prepare balance sheet and P&L for a period lesser than a year also. You might have to prepare it for a period lesser than a year also. Be ready for the same. Then let's go to the next one. After summarizing, you do analysis. Summary done. Balance sheet ready. P&L ready. What do we do now? Analyze. We'll analyze. Here it is this much. Here it is this much. Between them, you will find one relationship. Yeah. Profit is 10,000. Sales is 1 lakh. 10,000 by 1 lakh. 10% profit. Relationship. Analysis. Turnover is this much. Asset is this much. Turnover upon asset. Cash collected from debtors this much. Closing debtors this much. You'll find average collection period. You did this, no ratios. Average collection period. In your PU. Average payment period. No, skip. Oh my God. Current ratio. Liquid ratio. GP ratio. Net profit ratio. You know it? Forgot? All of that is analysis. In analysis, what do? We basically identify ratios. Relationship between two items which are there in the same financial statements. It is relationship between Angala. Relationship between two items within the financial statement. One upon the other. Ingingala. Identifying relationship between two items in financial statement. Example. Ratio analysis. Current ratio, liquid ratio, GP ratio, NP ratio, asset to turnover ratio, average collection period, average payment period, inventory turnover ratio, stock turnover ratio, employee turnover ratio, velocity, speed, not that. All this is ratios. Then where to show this analysis? It will not be shown in balance sheet. It will not be shown in P&L. It will be given in management report. Where will it be given? Management report for them to take decision. And when to analyze? Whenever management wants. Management wants one hot cup of tea and one report, they will do it with 3. If they want it weekly, weekly. If they want it monthly, monthly. If they want it annually, annually. It is not part of financial statements. It is in addition, which is as a part of report. Understood analysis? Interpretation. You did full analysis. Now you should do interpretation. You did 10% is the GP ratio. GP by sales. 10%. Good or bad? Tell ya. You can't tell. To tell good or bad, you need to compare no with somebody. Are you getting it? Last year you scored 20% GP. Oh, bad. Last year you had 20%. This year you have only, you compared it with last year to tell that it is bad. Interpretation. Or you made how much profit? 10%. In industry, everybody is making only 3%. Oh, good. Where everyone is making 3%, you making 10. So interpretation is comparison for decision making. So comparison can be internal, comparison can be external. Interpretation is meaningful judgment is there, no? To do that we compare. Comparison to enable meaningful comparison, to enable meaningful judgment. How to interpret? Internal comparison with past years or external comparison with industry. By this we're done with interpreting. The last one is communicating. After identifying everything, accountant will not decide, hey, Kamda will close the business, it's not doing profit only. What? No, you can't decide like that. What will you do? As an accountant, your responsibility is to give information. You will tell information. If they want, let them continue. If they want, they let them close. You don't get shocked. What will you do? You will only give them information. So communication means shouting out loud, you made this much profit, to the investor, to the management, to the user of financial statements. So communicating the financial information, accounting reports to the end users. Accounting reports will include two things. One, financial statements. Two, management reports. Financial statement means balance sheet, P&L, cash flow statement, all of this. Then management report is that ratio report. Whom do we give it to? End user. Who are end users? Two. Internal, external. Internal users. Proprietors, partners, board of directors, shareholders, employees. External, government, public, lender, borrower, supplier, customer, all of these people. These are all our external users of financial information. We need to give information to all of them. Why? Why should we give information to them? To help them take decision. To take decision, they need information. And we give them information. You understood? This is accounting cycle. In this accounting cycle, the first two stages, what are the first two cycles? First two stages. Recording and this recording and classifying together is called as bookkeeping. Recording and classifying together are called as, this bookkeeping is not the same as accounting. Bookkeeping and accounting are different. Shall we see what is bookkeeping? Look at the book, everyone. We'll go into it. Yeah. What is bookkeeping? What is accounting? Are they same? No, they're different. In bookkeeping, we do only journal and ledger. In accounting, we do what comes after ledger. Bookkeeping is boring, lethargic work. If you teach, no, 7th kid also can do bookkeeping. To do accounting, you need brains. In bookkeeping, there is no interpretation, there is no decision making, there is no analysis. In accounting, there is financial statements, there is analysis, there is brains needed. Skill is needed for accounting, not for bookkeeping. See, bookkeeping. What do you do in bookkeeping? Only recording of transactions. Accounting, summarizing, processing, needs brains. Here, pencil, pen idre saku. Anybody can do. For accounting, bookkeeping is base. To do financial statements, you need journal, ledger, trial balance. Without that, you can't do. So, accounting is the language of business. When the business talks, no, you tell, how's your business doing? What's your profit? What's your GP ratio? So, they talk in terms of accounts. So, the language of business is accounts. Financial statements are not there in bookkeeping. Financial statements are there in accounting. Decision making cannot be done based on bookkeeping. Decision making can be done based on accounting. Bookkeeping does not have subfields. Accounting has subfields. What are the subfields of accounting? One more favorite place where they can ask short note questions. Yeah, what are the subfields of accounting? Number 1, financial accounting. Number 2, management. Number 3, then social responsibility. Last one, human resource. Financial accounting, what we learn day in, day out, preparation of presentation of financial statements as well as interpretation. Management, based on that you make management reports to help the manager take decision. You give them reports, no? Those reports are called as management accounting. Management accounting comes after financial accounting. Cost accounting, In their manufacturing, you want to tell them how much cost are they incurring, where they can decrease the cost, how much profit should they charge on the cost incurred. So ascertaining the cost and controlling the cost is cost accounting. Social responsibility accounting, from the environment around you, how much benefit are you taking and how much benefit are you giving, how much benefit are you taking from the environment around you and how much is the benefit that you're generating for the environment for the benefits that you've taken. Social responsibility accounting. Last one, human resource. Employees are the important people in the organization. Don't make them work for 10 years. Uncle, artha aita? So these employees who work for so long, if you can record them as your asset in the balance sheet, how do you record? That's what we learn in human resource accounting. I hope everybody got it. This is human resource accounting, and by this we are done with accounting cycle. Let's discuss the next unit, which deals with capital and revenue. When we talk about capital or revenue, we're not talking about capital as in money contributed to start the business. It is not initial introduction of capital by the proprietor. Revenue does not mean sales. Here, capital means capital payment or capital receipt. Revenue means revenue payment or revenue receipt. I'll repeat. What does capital mean? Capital payment or capital receipt. Revenue means revenue payment or revenue receipt. I hope you got it. Now, have a look at this. Capital item. I purchase a building. Capital payment or revenue payment? I purchase a car. Very good. I purchase an aircraft. Super answer. Very good. Same faster lady. I purchase a hut. I purchase a tire. Super answer. I purchase a pen. All answers are wrong because you should ask more questions before you answer. You cannot jump into conclusion like that, like someone jumps from the top of the building. Okay, you need to answer cautiously. The payment will be considered as a capital payment or it will be considered as a revenue payment based on several points that should be considered before that classification. What are the points? Number one, what is the nature of the business? Just because I buy a building, it does not become capital payment. What if I am a dealer in building? I buy building, I sell building. I buy building, I sell building. If my business is purchase and sale of assets, it will not be considered as a revenue transaction. It will be called as a, sorry, it will not be called as a capital payment. It will be called as a revenue payment. What if I am a businessman, but not in buildings? I am a manufacturer. I bought one factory building. Then it will become capital payment. So, calling a payment as capital payment or calling it a revenue payment depends upon the nature of business. I buy a car. Capital payment or revenue payment? Depends. If I am someone who will buy and sell cars, revenue payment. If not, if I am not someone who will buy and sell cars, capital. Are you getting it? Nature of business is a very, very important characteristic. Next step, purpose. I am a dealer in buildings. I buy and sell buildings. I buy and sell, but I bought this building for my office. For my office. So nature of business is buying and selling buildings, but this building is going to be my office. So this building is not a revenue payment. It is going to be a capital payment. I buy and sell cars. I bought one car for my business to go from office to branch, branch to office, branch to customer, customer to branch, everything. So this car, I deal in cars. So I buy and sell cars. It is revenue payment, revenue receipt. But this car is a capital asset for me. So the payment made to buy this car will become capital payment. Are you getting it? So what is the first consideration to decide whether a payment is capital or revenue? Nature of business. Second one. Third one is recurability. If that specific payment is recurring in nature, revenue. If it is non-recurring in nature, capital. If it is recurring, revenue. If it is non-recurring, fantastic. If it is material, meaning the amount involved is huge, it can affect my decision making. I bought one pen which is 10 lakh rupees. Oh my god, I'm not going to throw capital payment. I bought one 10 rupees pen, I will throw revenue payment. So it depends. It depends on the materiality of the money involved in that specific transaction. You buy one 10 rupees pen, P&L account debit side, other expense. You buy one 10 lakh rupees pen, diamond is there at the top of the pen. The pen is made of gold. You get it? You write it in the balance sheet as an asset. Are you getting it? So material item, capital payment. Are you getting it? Then the next one is revenue generation capability. If that item for which you made the payment can generate revenue, then it cannot be called as a revenue. See, there's one Nai. That Nai is giving birth to, for those of them who don't know, Nai means dog. Kutta. Oh, 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 wow, 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 wow. That one. You know, what if people who are watching are very young, they don't know. So for them to understand, dog sound. Chinese, huh? China. Yeah, yeah, yeah. This name is Kadabom's Pablo Escobar. This black color dog, it ಮಂಜ ಮಂಜ ಕಾಣ್ತಾ ಇರುತ್ತೆ ಯಾವಾಗಲೂ ಅದು ಎಣ್ಣೆ ಹೊಡೆದಂಗೆ ಟೈಟ್ ಆಗಿ ಬಟ್ 100 ಕೋಟಿ ಇದು ನಾಯಿ. Okay. So that dog, if that dog, see, if that dog gives birth to puppies, no, if that dog is giving birth to puppies, that dog is not a puppy. ನಾಯಿ ಮರಿ ಹಾಕಿದ್ರೆ ಅದು ನಾಯಿ, ಅದು ಮರಿ ಅಲ್ಲ. You get it? So, if that item is generating revenue, it itself is not revenue. You get it? I bought one building. I bought one. What is my business? Buying and selling. I buy buildings, I sell buildings. I buy buildings, I sell buildings. You get this? This building, nobody is willing to buy. I bought it. I want to sell. Nobody is willing to buy. Rather than keeping it idle like that, I gave it on rent. Now it is generating me rental income. Rental income is revenue receipt. Rental income is because it is generating revenue receipt, that building cannot be called as revenue. It is capital item. I hope you got it. Because it is generating revenue, it cannot be considered as revenue. It will be called as capital item. I hope you understood. So what are the characteristics based on which we decide whether an item is capital or revenue? Nature of business, purpose, recurability, materiality, and revenue generation capability. Got this? Next, why do we classify payments and receipts into capital or revenue? Very important. Capital payments are treated different, revenue payments are treated different. If you make a revenue payment, expense. If you pay rent and then take the building on lease, that rental expense will go to P&L. If you pay full consideration and then buy that building, balance sheet asset. So revenue payments, expense. Capital payments, asset. So the treatment of revenue payments is different from capital payments. So to show the distinguishing in accounting, we need to classify them into revenue and capital. Why do we classify? Because their treatment as well as presentation is different. I hope you got it. Where do we present this? Capital and revenue items. Revenue items will go to P&L. Capital items will go to balance sheet. Revenue items will go to P&L. Capital items will go to. Then we have one beautiful item called deferred revenue. Deferred revenue. What is this deferred revenue? It is actually revenue, but it will look like capital. It is actually. It will look like. For example, if you pay rent and you take the building, what is it? Revenue payment. If you purchase the building and make the payment, what payment is it? Capital payment. But the dealer will give the building on rent to you, but he will ask for 15 months rent. What is it? It is deferred revenue. It is monthly rental expense only, but you paid it for 15 months. Let's say to buy the building, you need to pay 10 crore rupees. Rent is 1 lakh rupees. So you paid 15 months rent, 15 lakh. You pay monthly rent 1 lakh, revenue payment. You pay 15 crore and then buy capital payment. What if you pay 15 lakh and take it on 15 months rent? Looks like capital, but it's not. It is deferred revenue. You paid 15 different months revenue payment at once. It's called as deferred revenue expenditure. And this deferred revenue, in this year it is 12 months, 12 lakh you transfer to P&L. 3 lakhs for 3 months is next year's expense. So in this year, you call it asset. You keep it as balance sheet asset, prepaid expense. In the next year, you transfer it to profit and loss account. So what is deferred revenue items? Revenue items which act like they are capital. And as these are revenue items, they pertain to a period other than current accounting period. We will not be showing them in P&L completely. To the extent it relates to current year P&L, to the extent it relates to next year balance sheet. I hope you understood. Example, prepaid or outstanding items. You tell me what are prepaid and outstanding items. What type of asset are they? What type of account are they? Personal. What type of personal? Representative personal account. Wow, shabash. Good memory. You can raise your hand, bring it to your shoulder and then say shabash, shabash. If you got the answer right. If not, you can bring it near your cheek and then say wrong answer, wrong answer, wrong answer. Slap yourself before institute slaps you, okay? Then let's go to the next item. Accounting policies. This is actually a separate unit in your chapter. What are accounting policies? Whenever we're doing accounting, There are several instances where more than one solution is there for the same problem, more than one way to handle the same situation. If you're moving from point A to point B, you can take multiple modes of transport. You can take car, you can take cycle, you can go by flight if the flight doesn't get cancelled. Multiple ways of commuting for the same destination. Whatever you choose to follow is your accounting policy. People over there, that furniture equipment that you see the door, it will get depreciated. You should not, you can use it, okay, but you should not do abuse. So close the door softly. Don't bang the door. Request. Using the door is okay. Abusing the door is not. Okay. So for people who came back now, three of you. Door, soft close. I agree you are frustrated, but don't show it on the door. Done. So when there is more than one way of handling the same situation, now I can be angry and then shout, I can tell softly, and I can take him in the hand like do like yak puta. Or I can tell that. So I have three ways of telling the same thing. However, I choose to tell is my policy. Similarly, accounting also. Whenever you want to value inventory, you can do FIFO, you can do LIFO, you can do VAM, you can do SAM, you can do adjusted selling price method, you can do standard cost method, you can do marginal cost method, you can do retail price method. So many methods we'll discuss in valuation of inventory later. So whichever method you pick to follow is your policy. You getting it? Whenever you want to value a fixed asset, PPE, you can do cost model, you can do revaluation model. All of these are policies. What you pick to follow is your accounting policy. What is accounting policy? It is principles which are used in preparation of accounting. So accounting policies are accounting principles, methods which are applied in preparation and presentation of financial statements. What are accounting policies? It is accounting principles and methods which are applied in preparation and presentation of financial. Very good. Example, valuation of inventory, recognition of revenue, treatment of government grant, valuation of investments. All of these are examples. Method of depreciation is not. Method of depreciation is an accounting estimate. We'll discuss it slightly later. Then let's go to the next one. What are the cons of accounting policies? These accounting policies are there, no? There's a problem with this. Onda Yerada, Bejan problem. Number one, too many options, man. We don't know which one to pick. And when we have too many options, what if we pick the wrong person? Sorry, what if we pick the wrong option? You have to suffer for life, no? Long suffer for life, wrong person in life. So, lot of problems. And second one is comparable. Che, look at what he has. Look at what I have. Accounting policy. They have right accounting policy, you have wrong accounting policy. You will regret. So, comparability, yeah, is not there. Why? Last year you followed different accounting policy. This year you follow different accounting policy. Can it bring comparison? No. Next one. Is there standardization? You follow different accounting policy. I follow different accounting policy. No standardization. No uniformity. Like some of you come from the college, you are wearing all uniform dress. See the rest of them, they're wearing color dress over black, over white, over yellow. Yellow. Yellow also will wear. Brown. Then pink. This color shade. Checks. Floral design. Mini. And then like polka dots. So many variety. There is no uniformity. But what if we give all of you Yeshas t-shirt? Uniformity will come. You get that? And there is no reliability. What do you mean by no reliability? Now I want to show more profit. I will pick such an accounting policy which will show more profit. I want to show less profit. I'll pick such an accounting policy which will show less profit. So basically, I am cheater. I'm not teacher. I'm trying to do gambling. I want to show the profits like how I want. So you can't trust the financial statements what I prepare. Why? I'm playing with accounting policy to show the kind of result that I want. There is no reliability. And there's only one thing that is there. What? Difficulty in selecting the accounting policy. So what is the problems with accounting policies? Number one, no comparability. Number two, no standardization. Number three, no uniformity. Number four, no reliability. Last one, there's one thing that's there. What is it? Difficulty in selecting the accounting policies. How do we overcome all of this? There's one solution. Accounting standards issued by ICAI as well as guidance notes. What are accounting standards? Let's see what are accounting standards. To start with, you need to remember the Sing is king. Sing is king. Sing is king. Akshay Kumar, you remember? Not the Akshay Kumar, this one. The Sing is king Akshay Kumar. Then after that, you need to remember Shah Rukh Khan. Shah Rukh Khan, hey, that one. And then finally you followed it with Disco Divani. You know Disco Divani? Disco Divani, that black color. That one only. So you put all three together, definition of accounting standards. Done. So how do we define accounting standards? Okay, come on, let's make some movement. Oh my god. ಕಾಲೆಲ್ಲ ಇಟ್ಕೊಂಡ್ಬಿಟ್ಟಿದೆ ವಯಸ್ಸಾಗ್ಬಿಟ್ಟಿದೆ ಸರಿಗೆ So it starts with this. Okay, are accounting standards are written instruments issued by government, expert accounting body, or other regulatory body, covering the aspects of recognition, measurement, presentation, disclosure. Okay, let's put it up together. So once again, we'll do for you to see because you don't know all the words. No. Lights off ಮಾಡೋಣ ಡಿಮ್ ಲೈಟ್ಸ್ ಹಾಕ್ಬಿಟ್ಟು ಡಾನ್ಸ್ ಮಾಡೋಣ ಹಾಗೆ ಡ್ರಿಂಕ್ಸ್ ಸರ್ವಿಸ್ ಮಾಡ್ಬಿಡದ ಕ್ಲಾಸ್ ರೂಮ್ ಫೋಕಸ್ accounting standards. Everyone raise your right hand. Keep it over the head of the person sitting in front of you. Accounting standards. ಅಲ್ಲಿ 2-3 of you there. Yeah. ಮಾತ್ ಮಾತ್ರ ಆಡ್ತೀರಾ ಮಾತ್ ಮಾತ್ರ ಕೇಳಲ್ಲ. Accounting standards are written policy documents. Okay, or written policy documents. Editor, put some music here. Shah Rukh Khan. That one, okay. Yeah, accounting standards are written policy documents issued by government, expert accounting body, other regulatory body, covering the aspects of recognition, measurement, presentation, disclosure. That's definition of accounting standards for you. Now proceeding. In this, when we use the word government, we mean MCA, Ministry for Corporate Affairs, which has set up a body by name NACAS, National Advisory Committee on Accounting Standards, which is now replaced with NFRA, National Financial Reporting Authority, which regulates the accounting standards for corporates. When we say expert accounting body, we mean ICAI, which will issue accounting standards for non-corporate entities. And other regulatory body, at any point of time, any other body can get the power to issue accounting standards. Now, objectives, needs, and benefits of accounting standards. You remember what were the disadvantages, cons of accounting policies? What were they? No reliability, no comparison, no uniformity, no standardization, only difficulty in selection. Here, everything is covered. Full smile. It will bring in comparability. Why? I follow accounting standards, you follow accounting standards. My financial statements can be compared with your financial statements. Next one. Standardization. All of them have to follow standards. You cannot tell you will follow production units method. Accounting standard 10 will tell shut up and follow WDV, SLM, or production units based on this type of entity. They'll tell you can't tell I will follow that method. I'll follow. You can't change. I'll want to follow last in first out. No. AS2 will tell FIFO or VAM. So it will reduce. Are you getting it? And when you follow this, uniformity also comes, reliability also comes. When someone says these financial statements are prepared based on accounting standards, you can trust it more easily. But still, it will not reduce the number of options to 1. Out of 5, it will reduce to 2, but it will still give you options. So it will reduce the number of options, but it will not reduce it to 1. It will make it slightly easy for selecting. But the last point to note is accounting standards also has its own limitations. What are the limitations of accounting standards? It cannot override law, and still there will be difficulty to make choice in spite of accounting standards. In accounting standards also there will be a couple of options available. Got it? What is the process to set a standard? Step 1, they'll create one group of people who can discuss problem. They'll discuss the problem, they'll come out with one draft. This draft will be given to different bodies. These different bodies like SEBI, and then banking institutions or ICAI, they will check. They'll come out with one suggestion. Based on the suggestions given by these bodies, they will redraft it. Once the redraft is done, it will be circulated to public for comments. And public also gives suggestions. If it is valid, it will be considered. Otherwise, no. And that's how an accounting standard is actually formed. So identify the area, constitute a study group, prepare a draft or clarification, take view from different bodies. Result will be finally kept in the exposure data. People will review it and comments are taken from public. Ultimately, accounting standard is drafted after modifying if the changes are any. And using this, in our country, 32 accounting standards are issued. Out of them, 30, 31, 32 never became mandatory. 6 and 8 have been removed. So we have 32 minus 3, 29, minus 2, 27 accounting standards, which all 27 of them are part of your CA intermediate syllabus. Prayer from my side, all of you should very soon start learning them at your CA intermediate level. Now going further, in foundation, you need to know little bit of AS1, little bit of AS2, little bit of AS10, 26 as well as 29. This is what you should know in CA foundation. Other standards not important at foundation level. Let's start with accounting standard 1, disclosure of accounting policies. The name itself says disclosure. It's not telling you identifying accounting policies. It's not telling you how to follow accounting policies. What does it say? Disclosure. You follow whatever you want as your accounting policy, but tell me what you're following. Tell me what you are. Disclosure means opposite of closing. You need to tell openly. No, not keeping it a secret. So when you disclose, certain things need not be disclosed. I made you repeat multiple times when we did concepts and conventions. Three important things. What are they? Fundamental accounting assumptions. Going concern, accrual, consistency. What are the three? Going concern, accrual. Going concern, accrual, consistency are fundamental accounting assumptions. These need not be disclosed. You cannot tell, I'm going concern. Don't tell. I know. You don't have to tell accrual concept. You don't have to tell consistency. If you are not a going concern, if your entity is not following accrual concept, if you are not consistent in accounting policies, then you have to make disclosure. If you're following it, no disclosure. If you're not following it, disclose. Got this? Next comes changes in accounting policies. Can you change your accounting policy? Yes. Whenever you change your accounting policy, you are preaching consistency. You are preaching consistency says same accounting policies from one year to another. When you don't follow the same, not consistent, then what should you make? Disclosure. And when can you change your accounting policy? Only in three cases. RCB. When there is requirement by law. C. When there is change in accounting standard. B. For purpose of better presentation. So when can you change your accounting policy? For only three situations. 1. Requirement by law. C. Changes in accounting standards. B. Better presentation. Got it? And whenever you say RCB, three names come to your mind. What are the three big names that come to your name? Captain Kohli. And then ABD and Gale. Gale, going concern, ABD, accrual, Captain Kohli, consistency. Yeah, easy to remember. Then come to the next one. Who comes to your mind? Siraj. Patidar. Oh, lockdown kids. Come on. Let's. From 2008, if you've seen, three big names is ABD, Gale, and Kohli. You remember Siraj, what will you write there? Yes, substance over form. So three more things. Considerations for selecting accounting policy. AS1 doesn't tell which accounting policy to follow. AS1 will tell how to pick an accounting policy. You have so many options. Which accounting policy to follow is told by accounting standard. It's not told by accounting standard 1. But accounting standard 1 will tell how to select among the available choices. It will tell there are three considerations that you need to check for. Three considerations that you can consider. P, S, M. P, powerhouse. No, Gale. Chris Gale, power hitting. Yeah, yes. ABD is Superman. Captain Kohli. Captain Kohli is run machine, materiality. So that's how I remember. So three things. What are they? Prudence, substance over form, materiality. Prudence, materiality. Prudence means what? You need to be practical. When you expect, you write. When you expect an expense, you write it. But be practical when you expect. Don't be carried away. Don't be not neutral. You should be neutral. You should be prudent. You should be practical when you identify something. And based on the methods available, check the prudently possible method and then record. Example for prudence is conservatism. Expected expense and loss should be recorded, not expected incomes and gains. You have two methods. One is going to record the expense what is expected. One is not going to record the expense what is expected. Which one should you pick? Prudent method, which is a conservative method. Next one is substance over form. What does substance over form say? We need to give significance to reality over your legality. Legally, somebody else is the owner. Risk, reward, effective control, everything is transferred to you. Follow that. Reality. Don't go by legality. Are you getting it? You bought some shares today in the market, but it's not reflecting in your account because it will take 3 days now for the delivery to happen. It will still be in the name of that previous registered dealer. But will you record it in your balance sheet asset or wait? Record. It's your asset. Are you getting it? So we need to follow substance over form. Lastly, materiality. Consider prudence, substance over form, and materiality as a basis to identify your accounting policy. Pick it wisely. Got it? AS2 you learn in chapter 4 inventory. AS10 you learn it in your depreciation and amortization. Same with AS26. 26 also will be learned in depreciation and amortization. Then last one what we'll discuss is provision, contingent liability and contingent asset. Provision, contingent liability and contingent asset. What do you mean by provision? It's a present obligation from past event which would result in outflow of resources embodying economic benefits. Further, the reliable estimate of the accounts can be made thereof. Boring, no? Will not understand. Contingent liability is a possible obligation that arises from past event giving like either existence is confirmed based on occurrence or non-occurrence of one or more future events. No, see, we'll make it easier for us. What do you mean by contingency? It is an event. It is dependent on occurrence or non-occurrence, happening or non-happening of one or more future events, which are uncertain, uncontrollable, and future. Did not understand? Let's make it very simple. You have a girlfriend or you have a boyfriend. This girlfriend or boyfriend is not wife, not husband. This girlfriend can become wife. This boyfriend can become husband. Are you getting it? So that girlfriend becoming wife is dependent upon an event, wedding. That event can happen, cannot happen, and that event is in the future. It is not sure whether it will happen or not, and not in your control. You get this? So that is a contingent. What is contingency? It is an event dependent upon happening or non-happening of a future uncertain, uncontrollable act. You get this? Let's say you call that person as your asset. Not yet your asset. Contingent asset. If things go well, will become your asset. Your wife is your asset. Your girlfriend is your contingent asset. You understand? Wife and husband go home. Asset and liability will go to balance sheet. Home is balance sheet. For us, home is asset and liability will go to balance sheet. Asset and liability will go to, yeah, you can take your wife to your girlfriend. No, not alone. Not alone. Till where can you take? Till the gate. At the gate, you can say bye, tata, see you tomorrow, and then that's it. You can't take them home. Same. Asset and liability will go to balance sheet. Contingent asset and contingent liability will be disclosed in footnote. Will be disclosed in footnote. Balance sheet will tally. That's the end of balance sheet. That's the gate. Below that, you write footnote, disclosure. This is my contingent liability. You will record if it is contingent liability. Contingent asset will not be disclosed. Why? Conservative approach. Conservative. If you expect it to be a profit in the future, record it in the profit. Are you getting it? Nimge totu. Nothing. Chance sale. Then don't record it as your asset. Might not be your asset at all. You get it? If it is a contingent asset, wait for it to become asset. If it is a contingent liability, record. Record. Liability will be disclosed. Asset will not be when it is contingency. You got it? Okay. This contingent event, if it results in outflow, contingent liability. If it results in asset, contingent asset. Let's talk business. Let's take some business example. Now, you have filed a case on somebody. Because of them, you underwent loss. Now they need to recover money. You need to recover money from them. So, should you receive money from them? Yes. Pakka? No. Dependent on what? Court judgment. Court judgment. Can it go in your favor? Yes. Can it not go in your favor? Yes. So, you have a receivable which will be decided in the future based on the judgment of the court, which is future, which is not in your control, which is not sure, uncertain. So, that is a contingent asset because you are supposed to receive money. What if somebody files a case on you saying that you should pay them compensation? Should you pay them money? Maybe based on the court judgment, which is future, uncertain, uncontrollable. It might result in outflow, contingent liability. Are you getting it? So if a contingent event results in inflow, contingent asset. If a contingent event results in outflow, contingent liability. I hope you got this. Yeah, contingent liability. It fulfills two beautiful conditions. Number one, probable outflow. Number two, reliable estimate. We will create provision for the same. A contingent liability which fulfills two important points. Number one, probable outflow. Number two, reliable estimate will be called as provision. I hope you got this. See, if this is my balance sheet, this is my P&L, asset and liability will go inside. Footnote I'll disclose contingent liability. Contingent asset will not be disclosed even here. See, contingent asset, no disclosure. Provision is an expense when created. I'll write in P&L account expense side. Once it is created, I'll write in the balance sheet as a liability. Once it's created, I'll write in the balance sheet as a. I hope everybody understood. Now I want you to read the definition. Now see this, it will make sense. What is a provision? You remember the liability definition? Present obligation arising because of a past event which would result in outflow of resources. Same thing. Present obligation from past event which would result in outflow of resources. I told you contingent liability will become a provision when fulfills two conditions. Probable outflow, reliable estimate. See here, embodying economic benefits, probable. Further, reliable estimate can be made. The definition what they have given broken down into small parts. Do you get the sense of the definition now? What is contingent liability? I told you, no, there is a possible. What is liability? Present obligation arising because of a past event, which will result in outflow of resources. See, what is contingent liability? Possible obligation that arises from past event, and their existence will be confirmed only on occurrence or non-occurrence of one or more future events. Same to same contingent asset definition. In the place of obligation, there is asset. Contingent liability is a possible obligation. Contingent asset is a possible asset. I hope everybody got this. By this, we are done with contingent assets and liabilities. Last but one unit, Ind AS is a word that we have. It is Indian version of the IFRS, which is universally adopted for non-corporate entities. Always applicable is accounting standards. For corporate entities, based on certain limits in our country, for some companies, AS is applicable. For some companies, Ind AS is applicable. In CA Inter, you learn accounting standards. In CA Final, you learn Indian accounting standards. Got it? That brings us to the last unit of chapter 1, which is valuation principles. How do we value items? We have 4 valuation principles. Number 1, long ago when I bought it, whatever I paid, historical cost. If I sell it, if I buy it today, how much should I pay? Current cost. If I sell it today, what I get? Realizable value. In the future, using this, whatever cash I will generate, if I discount it to today's date using present value factor, whatever I get is future value of the present value cash flows is called as present value. How to record the items in balance sheet? At money measurement. How to measure it? Valuation principles. How many do we have? 4. 1, 2, current cost. 3, realizable value. 4, historical cost, the money that I paid when I initially purchased. Current cost, the money that I should pay if I buy it today. Number 3, realizable value, the money that I would get if I sell it today. Present value of the future cash flows that I'll get from the asset. Read, what is historical cost? Current cost? Realizable value? Present value? Future net cash flows expected to be generated by asset. By this, we come to accounting estimate, where if in case we cannot value a specific item based on principles, we estimate it. If we cannot value it based on the principles, we apply estimate. What is estimate? It is estimate means estimation, approximation made based on the past experience and the present situation. Two important words: past experience, present situation. I have this phone. How many years can I use a phone that I bought today? You told 3. How did you tell 3? In the past, you had one phone. That phone lasted 2 years. And you know why did it last 2 years? And now you know how to not use. So old phone lasted 2. This phone you'll use it better, because of which you'll use it for 3 is what you're estimating. Past experience, present situation, together 3 years. Accounting estimate. Accounting, after 3 years when I sell this phone, how much money will I get? You told 3,000. How did I get 3,000? Old phone when I sold, I got 1,000. That was 10,000 rupees phone I sold and got 1,000. This 30,000 rupees phone, if I sell, I'll get 3,000. That is accounting estimate. What is accounting estimate? Certain assets and liabilities which cannot be measured using valuation principles will apply accounting estimate. It is made based on existing situation and past experience. Whenever the time progresses, we will get more experience and will understand the situation better. With better understanding and more experience, we will change the accounting estimate. Example is depreciation, amortization, impairment loss, useful life, residual value, provision. When you say 2% provision for bad debts, how do you know only 2 out of 100 people are bad? Estimate. How do you expect the useful life of the asset to be 10 years? Scrap value to be 2000? Estimate. How do you expect the pattern of usage of the asset is same every year? SLM. Estimate. Everything is estimate. Did you guys understand this? By this, we complete chapter 1 of your CA Foundation Accounting. This chapter 1 is theoretical framework. Let's now begin with second chapter, which deals with counting process. The process of accounting, what we saw in accounting cycle, will be seen little at large in this chapter. We start with journal, which is recording. We go to ledger, which is classification. Then we learn summarizing stage, that is preparation of trial balance. Financial statement is there in some other chapter altogether only. Towards the end of this chapter, we'll also learn how to do rectification if you've done some error in accounting, that is recording or classifying stage. To begin with, recording stage. In recording stage, what do we do? Journals. Journals are day-to-day records which are maintained by the entity. The book is also called as primary or the original book of entry. And the process of recording the transactions in journal is called as journalizing. And the transactions, whatever we record in journals, are recorded in chronological order. First transaction first, second transaction next, third transaction third. 1st April transaction admele 2nd April transaction. You understood? Then the format looks somewhat like this: date, particulars, ledger, folio, debit, credit. Will not waste time on this. But let's go to the next part. How to pass journal entry? You might find it funny, but there was a question recently asked in the exam. How to pass journal entry? How to classify the items into ledger? What is the basis for classifying and everything? This kind of questions also can sometime come. Steps of our passing the journal entry: first identify the transaction, then identify the account involved in the transaction. Is it asset, liability, expense, income? Then apply the rule. Is it increasing or decreasing? Based on the rule, you decide whether it is debit or credit. Finally, pass the journal entry. Step 1, identify the transaction. Step 2, identify the items involved in the transaction. Step 3, apply the rule to see whether it is increasing, decreasing, increases debit or increases credit. Then write the journal entry at the end. Then we'll not waste time on basics part. Next, once the journals are done, we'll post them to ledger. In ledgers, we do classification. So this book is called secondary book. Journals are primary book. Ledgers are in ledgers, we record it based on the debit principal, credit principal separately. In journal, debit, credit together in one entry. In ledger, debit ella one kade, credit ella one kade. Because it is divided based on the principal, it is called as principal book of record. So journals are primary books. Ledgers are secondary or principal book of records. The process of transferring the journal to ledger is called as posting. And the entries are recorded here in analytical order. There in chronological order. Herein, first we analyze them. Which ledger does it belong to? Write it in respective ledger. Within the ledger, we apply chronological order. But before we write it to the ledger, we apply analytical order. I hope you understood. Then at the end of the period, ledgers will be either balanced or it will be transferred. So what do you mean by balancing or closing? Very simple. If the ledger continues to next year, we balance it. If it doesn't continue to next year, close it by transferring to P&L account. Balancing is done for real and personal account. You have land account, building account, plant account, machinery account. We'll write by balance carried over. If you have expense account, income account, it will be closed by transfer to P&L. If you have sales account, if you have sales return account, if you have expense, interest, depreciation, commission, interest income, interest expense, all of these items, rent expense, salary expense, these are nominal accounts. Nominal accounts are closed by transfer to P&L at the end of each year. And real and personal accounts are balanced and carried forward to the subsequent year. I hope you got it. Say something. Yes. Fantastic. So let's not waste time on taking the journal entry example and posting them to ledger. I hope you are really good at it because you come to the level of marathon revision. Then after journal ledger is done, before we go to final accounts, we prepare something called as trial balance. We'll check one trial if total of debits and total of credits are matching or not. That trial, what we do, checking the balance whether it's matching or not, is trial balance. What's trial balance? Checking whether the balances are matching or not. Because if the debits and credits are not matching, using that when I prepare balance sheet also will not tally. So instead of preparing balance sheet and then realizing that it will not tally, before the time I'll give one check. How do I give that check? I prepare trial balance. If trial balance tallies, balance sheet will tally. If trial balance doesn't tally, then you know something is wrong even before I start with balance sheet. So trial balance is a statement comprising of all ledger balances. This is prepared with multiple objectives. Objective number 1, to check the arithmetical accuracy. Objective number 2, to have extract of all the ledger balances. When I sit to do balance sheet and P&L, I need lot of ledger balances. I need lot of when I need lot of ledger balances, no, I can't go every time to one ledger, see right, go, see right, go, see right. First time taking. So all the ledger balances, I'll write in one paper. I'll bring that paper. I'll keep that paper next to me. Then start preparing balance sheet PL. So then everything that I need is there in one paper. So that paper is trial balance. What is the objective? Two things. One, to check the arithmetical accuracy. Two, to help us in preparation of final accounts. Three, to help us as a summary of all the ledger balances. There are three methods in which trial balance can be prepared. Before that, when is trial balance prepared? Very good. You cannot say, we cannot say, we want to say, at the end of the year. At the end of the year is wrong answer. Before final accounts. Before, you want final accounts every year. You prepare trial balance every year. You want final accounts every quarter. You prepare trial balance every quarter. You want balance sheet P&L every month. You prepare trial balance every month. I hope you understood. So just before preparation of financial statements, you prepare trial balance. Got this? How to prepare trial balance? How? There are multiple methods. One, total method. Two, balance method. Three, total and balance method. How to prepare it under total method? Very simple. Balance sheet, one ledger account. Debit side, you have opening balance 10,000 of one asset, machinery. Opening balance is how much? 10. Credit side depreciation is 1,000. Opening balance, debit side 10. Credit side depreciation 1. If you write balance carried down 9 and then 9,000 you write in the trial balance, that is balance method. Total on the debit side 10, total on the credit side 1. You will write asset in your trial balance with debit side 10, credit side 1. That is total method. That is under total and balance method. What do you do? Trial balance will write particulars: debit amount, credit amount, total debit, total credit. What do you write for that machinery? Debit column you will write 9,000, credit column 0. And in total debit you write 10, in total credit you write 1. That is your which method? Total and balance method. I hope you understood. So what are the methods? Total method, balance method, total and balance method. One second. I'll show you some balances and then together you will see. When you see, you will understand. See, under total method, what do? You write both the items. So for example, cash. Receipts is 50. Payments is 13. So net cash balance is 37. Am I right? I won't write 37. It is total method. I write 50 and 37. 15 and 50 and 13. Under balance method, I'll write my cash as 37. Under total and balance method, what do? I'll write both. 37 debit balance, 50 total debit, 13 total credit. So these are the methods of preparation of trial balance. You never know. Of late, the way they're asking question paper, they'll ask question from some new corner also. If you skipped all these cute, sweet, tiny concepts, what if they put one small 6 marks question on trial balance under total method? Total method. You will be like balance and figure, what do you write? They will tell no problem. Next time you learn and come and tell. So don't give that chance. Everything is important. What's there in the material? Yeah. Don't do any analysis. This is more important. This is less important. Everything is important. What if the trial balance doesn't tally? Yes. We would have to adjust the trial balance before we proceed to final accounts because already it is late. You can't still delay that. You will prepare balance sheet and P&L only when trial balance tally. That will be too late. That will be too. You can't do that. So what do? Even if the trial balance doesn't tally, you will quickly put suspense account, close the trial balance. Once that is closed, that trial balance is called adjusted trial balance. Why is it called adjusted? It did not tally. You made it tally. They say no. ಬೆಳ್ಸಿದ್ದಲ್ಲ ಬೆಳ್ದಿದ್ದು like that. Tally ಆಗಿದ್ದಲ್ಲ tally ಮಾಡ್ಸಿದ್ದು. It did not tally. We put some suspense and then made it tally. This trial balance as error. You would still have to rectify the error. But we are not keeping the final accounts waiting till the time error is rectified. Wrong trial balance, prepare balance sheet and P&L. When you identify that error you correct. Rest of it is all okay, no? Just for one mistake, don't keep the whole balance sheet and P&L waiting. I hope you understood. This, my friends, is trial balance. And then the last but one part in this unit before we go to rectification is subsidiary books. So subsidiary books are prepared in the place of journals. Instead of doing journal, what do? Subsidiary books. If the entity is small, journal. If the entity is big, it will become too difficult to write journal and then post them to ledger. So what do? Journal, when we are writing only, we'll maintain 5 different journals. This journal is for sales, this journal is for purchase, this for sales return, this for purchase return, this for bills receivable. That is special journal, which is called as subsidiary books. In subsidiary books, we can call them as primary books. This is in place of journal. They're called as special journals. They're prepared alternative to journals. Why do we prepare? Because the following advantages are there. One accountant, one book. He can write only one transaction at a time. When we put 4 accountants and then make one guy sales specialist, one guy purchase specialist, one guy purchase return specialist, one guy cash specialist, at a time 4 people will pass 4 different transactions in 4 different books. Work will get done smoothly. They will become expert. Work can be divided. Inspection. If I want to check the cash book, other books may entries are simultaneously going. So these are the advantages because of which I prepare subsidiary books. What are they? Number one, division of work. When you divide the work, specialization and efficiency will increase. Third one, it will save time. So these are the advantages, and also you can check information more detailed, and facility of checking when you're doing the work will not stop. You're checking one person's financial statement. Somebody say you're checking cash book, purchase, sales return, purchase return will not stop. That will be continued. I hope you got it. Yes, sir. Then when do we prepare subsidiary books? Day-to-day basis. It's like your journal. It's like your journal. For a small entity, journal. For a big entity, subsidiary. And accounting cycle, we discuss the same thing. I hope you remember from there. How many subsidiary books are prepared? And name them. Same. Sales book, purchase book, sales return, purchase return, bills receivable, bills payable, petty cash book, and journal proper. Let's see each of them slightly in detail. Let's begin. Sales book. In sales book, what do you write? 2 important points to note. Number one, it should be sale of goods. Number two, it should be credit. Number one, goods. Number two, credit. What if it is sale of asset? No entry. What if it is sale of goods but for cash? No entry. It should be sale of goods and it should be on credit. You record it in sales book. At the end of the period, total of sales book will be posted to sales account. At the end of the period, total of sales book will be posted to sales. Are you getting it? If there is trade discount, what do you do? Deduct. If there is GST, what do you do? Add. If both of them are given, deduct trade discount, add GST. Which one first? Discount first. GST next. Why? If you first add GST and then give discount, you are giving discount on GST. Who gave you the power to give discount on GST? So, first trade discount adjustment, then GST adjustment. GST, which GST to apply? SGST, CGST or IGST? Within the same state, SGST, CGST. 2 different states, IGST. You get it? If you purchase, input CGST, input SGST. If you sell, output CGST, output SGST. Understood? Very nice. Come on, let's go to the next one. So after this, total of sales book will be posted to sales account. In sales account, you will write credit sales and cash sales, both. In sales book, you write credit sales only. In sales book, credit sales only. In sales account, credit sales and cash sales, both. I hope you understood. Then come to purchase book. In purchase, we record purchase of goods. Purchase of goods on credit only. So it should be goods, it should be credit. What if it is cash purchase? No entry. What if it is credit purchase but of asset? No entry. Understood? Total of purchase book will be posted to purchase account. In purchase book, only credit purchase. In purchase account, cash purchase, credit purchase, both will come. I hope you understood. And here also, deduct trade discount first, then add GST. First deduct trade discount, then add GST. Don't add GST first and then deduct trade discount. And remember, they'll say furniture shop, they'll say machinery purchase, they'll say light bulb purchase. It's not inventory. Are you getting it? So they'll say furniture purchased. That will be inventory for a furniture shop. So remember, they'll play with the language. What transaction to be recorded and what transaction should not be. Sometimes some transactions given in the question should not come in your sales book or purchase book. Don't include one wrong item. Then sales return book, purchase return book. If previously you entered in sales book and now those sales have been returned by the customer back to you, it is sales return. Previously you sold the goods on credit. Customer did not like, is rejecting the product, returning it to you. Sales return book. Total of sales return book will go to sales return account. Sales return, I hope you understood. Very nice. It should be credit. It should be sale of goods, return. And in sales return book, you'll open one column called as credit note. Why do you open credit note? Tell me the journal entry for sales. Sales account debit to debtors. Come on. Debtors account debit to sales return will be ulta. What will be the entry for sales return? Sales return account debit to, let's say I am your customer. Let's say I am your cute customer. I bought goods from you. I don't like it. I am returning it to you. What is the journal entry you will write? Sales return account debit to debtor. You wrote my name, no? Debit or credit? You should inform me that you have created my account. If you inform me that you have created my account, I will write your account debit in my books. To me, it is purchase return. Are you getting it? How do you inform me that you have credited my account? You will take printout of that journal entry and give it to me. In that printout, you have credited my account. I want to take a note that you have created my account. You want me to take a note that you have created my account. That note that you give when you credit my account, credit note. Understood? Whenever there is sales return, you will give me credit note. Whenever you give me credit note, you won't write in sales return book. Remember, whenever you return the goods, whenever I return the goods to you, sales return, you will give me credit note. Whenever you give me credit note, it's not sales return. You can credit my account hundreds of times. You give me goods, no. Chichi, pathetic goods, poor quality. I will tell, I'll sue you in consumer court. Like, no, take this credit note, 10,000 rupees. I bought goods from you for 25. How much money should I give you? 25,000. You give me credit note of 10,000 because goods are of poor quality. Is it sales return? Goods are with me. Should you write in sales return book? When should you write in sales return? When I give the inventory back to you. Understood? I'm a very, very good boy. I gave you money on time. You're reducing the money that I should pay. So you gave me one credit note. Should you write in sales return book? No. You will write in sales return book only if it is sales return. On sales return, you will issue credit note. When you issue credit note, it is not sales return. It need not be sales return. I hope you got what I'm trying to tell. Everybody, fantastic. Purchase return. Previously you purchased on credit. Now you return purchase return. Previously you purchased on credit. Now you return purchase return. It will be recorded in which book? Purchase return book. At the end, you will close it and transfer to purchase return account. Now you have bought goods. What is the journal entry when you buy? Purchase account debit to creditor. When you return it, creditor account debit to. Am I right? Creditor account you're debiting? No. You should inform me that you're debiting my account. You take a printout and you give it to me to give me a note that you have debited my account. Debit note. Debit note is written in purchase return book and then credit note is written in sales return book. I hope you understood. By this we're done with this. Then we'll go to bills receivable book. Whenever that bill of exchange is given, basically by me to you it is receivable. You write in bills receivable. Whenever you give bills of exchange to your supplier, bills payable book. All transactions which are affecting cash, whether it is capital or it is revenue, whether it is expense or it is income, whether it is purchase or it is sale, whether it is purchase return or it is sales return, you will write it in cash. Cash book, all cash transactions. When it is receipt or payment, income or expense, purchase or sale, purchase return or sales return, all transactions will come in cash book. Sales book, sales return account, there is sales account, sales book, there is difference. Purchase book, purchase account, there is difference. Why? Sales book only credit purchases, sales account credit and cash. Purchase book only credit purchases, purchase account cash and credit. Cash book, cash account same. Cash book and cash account both are same. So subsidiary books are journals, primary books of records, not principal records, whereas ledgers are principal books of records, secondary books. So there is difference between sales book and sales account, purchase book and purchase account, but cash book and cash account are same. Cash book is primary book of record, cash book is principal book of record. Cash book is primary as well as principal book of record. Types of cash book: simple cash book, double column cash book, and triple column cash book. Help me. Simple cash book only, how many columns will be there? Meaning date, particulars, bit to one amount column. When you say one column cash book or simple cash book, it's not one column, it's one amount column. When we say two column cash book, double column cash book, it is two columns. It is not only two, it's like two amount columns. What will be there in simple cash book? Which is that one column? Can be cash, can be bank. One of them. It doesn't say cash column, it says one amount column. Why? I'm a businessman who doesn't accept cash. In our business, no cash, only payment through bank account. So then what will I do with cash column? Only bank column. You get this? What if I do business? Cash also, bank also, double column. What if I don't accept cash? I'll only accept payment through bank, but I also allow discount. Then in two column cash book, you'll prepare bank column and discount column. What if I say in my shop, no Paytm, no Phone Pay, no Google Pay, only cash only, but I'll give discount. Only prepare only cash column, cash and discount, double column. I'll accept cash, I'll accept online payment, I'll accept discount also. I'll give discount also sometimes. Cash, bank, discount, three column. Usual misconception is simple cash book or single column cash book means cash column. No, it can be only bank column. Two column means cash and discount. No, it can be cash and bank. It can be bank and discount, or it can be cash and it can be bank and discount. Three column means cash, bank, and discount. You understood? So receipt side. Once again, help me here. See, this is how it looks. Debit side anta baribardu. Receipt side anta baribeku. If you write debit and credit, it becomes cash account. In cash account, you should write particulars on both sides. If you write receipts and payment, don't write debit credit. If you write debit credit, don't write receipts and payment. If you write debit credit, write particulars. If you write receipts and payment, call it cash book and don't write debit credit. Got this? You write debit credit also, you write cash book also, you write receipts payments also. Chee, don't do it. Yeah, do either ledger or do cash book. Don't mix them. Got it? Now on the receipt side, every inflow of cash will be recorded. Am I right? Discount received will be recorded where? Discount. Wow, very good. Discount. Wow, Didi, wow, wow, Didi, wow. Discount received will be discount column. Correct answer. Correct answer. Which my question wasn't. Which side discount column? Huh? Discount received. Receipt side or payment side? Receipt side. Discount received. Receipt side. No. Receipt is for cash. Payment is for cash. Discount received is income. Discount received will be written on the credit side. Discount allowed is an expense, debit side. Remember, discount is nominal account. Cash is real account. Bank is personal account. Discount is nominal account. Cash is real account. Bank is personal account. This is one place where we write real, personal, nominal together in one place. Discount, debit all expenses and losses. Expense increase debit, expense decrease credit. Discount expense, discount allowed debit. Discount received credit. Cash and bank, money received debit, receipt. Cash and bank, money paid credit. I hope you got it. Say something. Fantastic. That's with regard to cash book. Then let's see petty cash. What do you do in petty cash? Record all the petty transactions, small payments, which are not very significant. Yeah. In order to record, in order to save time, in order to save labor, in order to save the time of the main cashier, there is one cashier to whom you give money and ask him to make payments. Whatever payments he make, he'll write in petty cash book. In petty cash book, you'll open multiple columns for payment. Receipt is only from cash book. Payments will be multiple expenses, multiple columns. You don't have to mug up the columns. If that expense is there, draw that column. If that expense is not there, don't write it. It is same receipt, payment. Receipt will be from cash book. Payment will be wages, postage, telegram, carriage, all separate columns. If that expense is there, write the column. If expense is not there, don't write the column. There is no specific order also. You can jumble the columns. Are you getting it? This petty cash book is prepared based on the system called as impressed system. What system? Impressed means there's one limit, 10,000. 10,000 will be put into the petty cash. They spent 2,000, balance came to 8, 2,000 will be put to bring it back to 8. You put 10,000, it's become 4. 6,000 it decreased, no? You put 6,000 to bring it back 10. If it becomes 0, you put full 10,000 and refill it to 10. Impressed system means a specific amount is tagged. If the money is spent, reimbursement will be done to bring it back to the same old limit. This system is called impressed system. I hope everybody understood. Very good. Then lastly, journal proper. This is residuary book. Transaction which will not go to any of the previous books will be written here. These are, for example, depreciation on asset, not purchase, not sale, not sales return, not purchase return, no bills receivable, no bills payable. It is not a cash transaction. It is not a petty cash transaction. We'll write it here. Adjustment entries, closing entries, provision entries, rectification entries, depreciation entry, all that will be written in journal proper. It's a proper journal book. The format of journal proper is journal only. Date, particulars, ledger folio, debit amount, credit amount. Got it? Done. By this we come to the end of accounting process. We have one last unit left in our chapter 2, which is rectification of errors. Let's now start with last unit of chapter 2, which deals with rectification of errors. See, galti se mistake has happened. How long do you crib about that mistake that has happened? Take action. correct it. That's what we are trying to learn. To err is normal. To rectify is humane. Let's rectify the errors which has happened. To rectify the error, we need to know the type of the error. Type of the errors are two. One, non-clerical error. Two, clerical error. Clerical error means error happened because of the clerk. Non-clerical error means even if it was computer, this mistake was still possible. Yeah. What are non-clerical errors? Principal errors. Principal error, not this, okay? Principal, principal policy, principal. So if you apply the principle incorrectly, then the error will happen. That is called principal errors. These are non-clerical errors. What do you mean by non-clerical errors? These errors can happen even when you do computerized accounting. For example, treating a capital item as revenue or treating a revenue item as capital. You purchase inventory. What is the journal entry? Purchase account debit to cash or purchase account debit to creditor. You know what did you do? Instead of writing purchase account debit, you wrote furniture account debit or you wrote asset account debit. It's a revenue payment or so it's a revenue transaction. You incorrectly treated it as a capital transaction. That is principal error. Transaction recorded in contravention of accounting principles. Transaction recorded in contravention of accounting, treating a capital item as revenue or revenue item as capital. That's principal error. So remember capital revenue what we had discussed. An asset is purchased. You should write asset account debit. You wrongly debited it to purchase account. Or repair expense is incurred. Entry should be repair to cash. Instead you wrote asset to cash. What is it? Principal error. Got this? Next, clerical errors. These are happening because of clerk only. If it was computerized accounting, these errors would have not happened. What are they? Omission, commission, compensation. Omission can be further classified into two. Complete omission, partial omission. Complete omission. A transaction happened. You completely omitted the transaction. You never recorded it. Last night's palak paneer. Basically, you purchased inventory. You did not write debit. You did not write credit. You did not write the transaction. What type of error? Complete omission error. What type of error? Example: asset is purchased, not recorded. Repair expense. Now, the next one is error of partial omission. Error of what do you mean by error of partial omission? A transaction has happened. You recorded it partially. You purchased goods. You wrote purchase account debit. You stopped. You have written credit, no credit off. You did not write. Partial omission is where you recorded the transaction partly. You recorded debit, but you did not record the credit. Not recording part of the transaction in the books of accounts is partial omission. Example: asset purchase recorded in the cash book, but not posted to asset. Repair expense debited to expense account, but not recorded in cash book. Got this? Then commission error. What do you mean by commission error? An error has happened because the transaction is recorded but wrong amount or in wrong account. A transaction is recorded in the wrong amount or in the wrong account. Instead of writing to Ram, you wrote it to Shyam. Instead of writing to Beam, you wrote it to what to say someone Bindu. Instead of writing 6 7, you wrote 7 6. Transaction is at 67 rupees. You wrote 76. So that is error of vision. So transaction entered at wrong amount or in wrong account. Yeah, you purchase good from Dolo. You write purchase to Dolo. You wrote purchase to Bolo. You shirt pant tone, you shirt color on, pant color matching. You got confused. You purchase goods for 4,500. You got full confused. You wrote 5,400. What type of error? Error of last one, compensating error. What's compensating error? You didn't do one error. You did two errors. Now it looks like you have not done one error. You received 100 rupees from somebody. Should write cash to that person. Should write cash to what to say Dolu. Instead of receiving cash and writing cash to Dolu, I wrote Dolu to cash. I made one mistake. Next, I paid cash to Beam. When I pay cash to Beam, should I read Beam to cash? No. It was like when I received cash, I created cash. When I pay cash, I should debit cash. I wrote cash to Beam. Now, if you look at my cash account, it looks like there is no error. But actually, there are two errors. Are you getting it? So, what do you mean by compensating error? Effect of one error has cancelled out error, which is another error. Are you getting what I'm trying to tell? But actually, there are two errors. Asset purchased is credited. Another asset purchased is debited. Oops, two mistakes. Are you getting it? Compensating errors are actually not self-revealing. It's difficult to identify. Yeah, makes it more difficult to rectify. In order to rectify the errors, we need to identify the impact of these errors on our trial balance. Based on the impact that these errors create on the trial balance, I can classify them into two categories. One, one-sided. Two, two-sided. One-sided means will impact only one side. It will impact only one side. It is called as one-sided error. This will lead to mismatch of trial balance. If it is two-sided error, it will impact debit side also. It will impact credit side also. In spite of this error, trial balance will still tally. It will tally at the wrong amount, but it will still tally. That is two-sided error. Shall we have a quick check whether you can identify one-sided, two-sided errors? Help me. Principal errors. One-sided, two-sided. One-sided, two-sided. Two-sided. This will not lead to mismatch of trial balance. In spite of principal errors, trial balance will still tally. In spite of principal errors, trial balance will still. Sir, artha agli. You tell me what is the journal entry for purchase of machinery? Machinery account debit to cash. Instead of writing machinery account debit to cash, you wrote purchase account debit to cash. Principal error, trial balance will tally. In the trial balance, instead of machinery 10,000, you have purchased 10,000. But trial balance will still tally. Two errors there. One, machinery should have been written. You have not written. Purchase is written. You getting it? Two sides there is error. One side in machinery, one side in purchase. In spite of that, trial balance will tally. So this is called as two-sided error. Error of principal. Do you agree? Then let's go to next one. What about error of complete omission? Completely you have not recorded a transaction. Still trial balance will. This is two-sided error. Understood this? Then what about error of partial omission? You recorded one side, you have not recorded the other side. So you have recorded debit, you have not recorded credit, or you recorded credit, you did not record debit. Partial omission. Error of partial omission. Trial balance will agree. In spite of this error, trial balance will still, sorry, because of this error, trial balance will not agree. Why? You recorded one, but you not recorded the other. Are you getting it? Then one-sided error. Come to next one. Help me. What about error of commission? Can be one-sided, can be two-sided. When you do error in amount, you can do two sides or you can do one side. Got that? Last one. Compensating. Compensating is usually two-sided error. Usually two-sided. Trial balance will agree in spite of this. Anybody has any small doubt? Can I proceed? Rectification of these errors will depend upon the stage at which the error is identified. The stages at which it can be identified. Stage 0, instantly. You made the error, you identified it's the error. Rectification will be scratching and rewriting. No accounts involved. Understood? Scratch and rewrite. No accounts. That's joke. Okay. Stage 1. That is, you identified the error not immediately, but well before you prepare trial balance. Sometime during the year, before you tried the trial balance and then identified, before that only you understood. Then what to do? You need to see if it is one-sided or two-sided. If it is one-sided, you do adjustment. If it is two-sided, you pass journal entry. Why? To pass rectification journal entry, you need two sides. To pass rectification journal entry, you need, if you have two sides, you can pass entry. If you have only one side, can you pass entry? No. So you'll do adjustment. Purchase account, cash account. Journal entry is purchase to cash. Error is only in purchase book. Or error is only in purchase account. Cash account will not make any entry. In purchase book, you make adjustment. What if the error is in purchase and cash both? Pass journal entry. Purchase to cash. Are you getting it? One-sided error before trial balance. Adjustment. Two-sided error before trial balance. Journal entry. Come to stage 2. After trial balance. You prepare trial balance. Trial balance did not tally. After that, you understood that there is an error. Then what to do? One-sided. Pass journal entry only with suspense. Yeah, okay. When the trial balance did not tally, you put suspense and you close the trial balance. No. So one side there is error. One side there is suspense. We have two aspects. You can pass journal entry. For example, you are supposed to write purchase to cash. You did not write purchase. You wrote only cash. Trial balance did not tally. Debit side there was difference. Debit side you wrote suspense. Now debit side there is suspense. There should have been purchase. So you should remove suspense, purchase. Suspense account will be credited. Purchase account will be debited. You can pass journal entry with suspense. Are you getting it? What if it is two-sided error? Then you'll pass journal entry without suspense. Even if the error is identified after final accounts, same. One-sided journal entry with suspense. two-sided journal entry without suspense. Now you might ask, sir, stage 2 and stage 3 looks alike. What is the difference? There is a difference between stage 2 and stage 3. The difference is in stage 3 rectification. That is when the errors are identified after final accounts. We cannot use nominal accounts. What are nominal accounts? Sales, purchase, sales return, purchase return, expense, income. These accounts cannot be used. If these accounts come in the journal entry, replace them with P&L adjustment account. Replace them with. Did you understand? So in rectification at stage 1 and stage 2, that is before trial balance and after trial balance, but before final accounts, you can use all the accounts in rectification. When you do rectification at stage 3, that is after final accounts, you cannot use sales, purchase, sales return, purchase return, expense, income. You will replace them with profit and loss adjustment account. I hope you understood. Fantastic. What are the steps to pass rectification entry? Step 1, identify the wrong entry. Step 2, reverse the wrong entry. Step 3, pass the correct entry. These are the steps which you don't have to write in the exam. These are steps for you. Rectification entry is reversal of wrong entry plus correct entry. Step 1, wrong entry. Step 2, reversal of wrong entry. Step 3, correct entry. Rectification entry is reversal of the wrong entry plus the correct entry. Reversal of the wrong entry and correct entry together will become rectification entry. I hope you understood. Certain small points that I want you to note before we say chapter 2 is done. Whenever you do question on rectification of errors, they will 100% tell in the question whether it is before trial balance or after trial balance, whether it is after final accounts or before final accounts. It will be told. You just have to read the language of the question clearly. Read the first line, read the last line. You will understand. Somewhere they'll tell next year following errors were identified, or previous year they'll tell in the process of preparation of trial balance, or in the process of preparation of final accounts. They'll tell in the language of the question. Read it to understand. If they don't tell, always assume stage 2. Always assume stage 2. That is before final accounts. Before final accounts. It will be stage 3 only if they mention it is stage 3. It will be stage 3 only if it is mentioned as stage 3. They will tell that final accounts are over. Now you identified. Got it? Whenever you do stage 3 rectification, very important point. After you do all the errors rectification, wherever there is expense or income, you replace with P&L adjustment. Take your calculator, take all the P&L adjustments, debits, add, credits, minus. Identify the net balance. And whatever is the balancing figure in the P&L adjustment account, transfer it to capital. Write the journal entry, P&L adjustment to capital, or capital to P&L adjustment. Very important. If you don't write this entry, you will lose marks. I'll repeat. In stage 3 rectification. In which rectification? Stage 3 rectification. After rectifying all the errors, what do we do? Total P&L adjustment account balance. Transfer it to which account? Capital account. Understood? Third point, last point when it comes to rectification. Shall I?
Yes, sir.
If in case the rectification is at stage 3, there is an error in the previous year and they've closed the error, they've closed the trial balance by passing the figure to suspense. Very good. But in the previous year, if they've closed the trial balance by writing the difference to P&L, oh, mistake. The trial balance doesn't tell you, where should we write? Suspense. What if they write it to P&L? That is one more error which we should rectify. That is one more error which we should rectify. How to rectify? Simple. You take all the P&L adjustments, debits, credits, total, transfer it to capital. Similarly, take all the debits, credits of suspense account total and also transfer that to capital. I'll give you the reason. If in case last year we created suspense when the trial balance didn't tally, when we write rectification entries, suspense will get cleared. Suspense will get closed. However, if you did not write suspense only last year, if you wrote it to P&L, profit has become wrong. Because of profit, capital has become wrong. Now, close the suspense account by transferring it to capital. Shall I repeat? When rectification is to be done, identify the stage. Very important. They will mention in the question. If they don't mention, assume it to be stage 2. If it is stage 3, they will openly mention in the question. If it is stage 3 rectification, what should we do? Close P&L adjustment account balance by transfer to capital. If it is previously closed by not opening suspense, instead by transferring to P&L, then what to do? Then close suspense account by transfer to capital account. Understood? That's it. By this, we've understood rectification of errors also. Don't assume an error. If there is an error, they will tell. If there is problem only with debit side, don't assume credit side also something is wrong. No. If they tell debit side wrong, only debit side wrong. Credit side nothing is wrong. And make good your English skills. English speaking very important in rectification of errors. You understand what I'm telling? Yeah. Let's get going. We'll start now with chapter 3 of your syllabus, bank reconciliation statement. Your favorite, and which one? The one which you'll really hope that it comes in the exam. 14. Wow. Good. Bank reconciliation statement. But not the kind of question that came in September 25. That was actually doable. You just had to be mentally ready for it. Let's talk about it later. Bank reconciliation statement. What is bank reconciliation statement? As the name says, it's a statement. What does the name say? What is BRS? It's a statement. It's not an account. The subject is accounting. The course is chartered accountancy. You are going to become a chartered accountant. But why are you supposed to read a statement when it is not an account? It cannot even become statement. It cannot even become an account. Why is it part of our syllabus? Because the objective of this chapter is to reconcile. What does this statement help us with? Reconcile. Reconcile means what? It's a statement, not an account. Reconcile means what? Two people are bejan fighting. You go to them and then ask, okay, stop fighting. Please tell me, why are you fighting? Why? You are going to help them resolve their fight. That if you ask, no, why are you fighting with an intention to help them resolve the fight? That is reconciliation. That's it? So if two people are fighting, you go ask them what is the problem. That's reconciliation. Here also, there are two people fighting. Who are two people? One, bank balance as per cash book. One, bank balance as per passbook. Cash book is telling, hey, 10,000 is the correct balance. Hey, 12. Both of them are fighting. You will not sit there and then like they're fighting, you will drink tea and watch. No. You will go to them and then ask, what's your problem? 10. What's your problem? 12. Let me see. You give me your statement. You give me your statement. I will see. What is the intention with which I check both the statements? To see what is the reason for difference. To see what is the reason for. Once I identify the reason for difference, I will tell them, hey, it's your mistake, not this. You please correct this mistake. Don't spoil him. And then this is like, hey, wait, you also have done this mistake. You also should correct this. So the entire intention of identifying the differences between cash book and passbook is with an intention to rectify if there is any error. To be very, what to say, technical, no, I can make this statement saying that bank reconciliation statement should have not been chapter 3. It should have been extension of rectification of errors. It should have been there only. Because rectification of errors is what we do in BRS. What is the objective of bank reconciliation statement? To identify the reason for difference, and if there is reason for difference which is an error, we have to rectify it. Are you getting it? This is specialized version of rectification of errors. We rectify all the variety errors in rectification of errors. Errors with regard specifically to cash book are rectified in BRS. I hope you got it. Observe. So it is not where bank balance as per cash book is given, we find passbook balance, or passbook is given, cash book is to be formed. No, that's not BRS. BRS is identifying the reasons for difference. What do you mean by reconcile? To know the reason for difference. And among those reasons, if there is an error, error of omission, error of commission, we need to rectify. Now let's focus on the word difference. What do you mean by difference? Two people see two things differently at different points of time. That's the reason we call it a. Let's focus on the word difference. Difference here to be identified between two things. No, what are the two things that we're talking about? Two things that we're talking about is bank balance as per cash book and bank balance as per passbook. What are the two things that we're talking about? Bank balance as per cash book and bank balance as per focus. What do you mean by cash book? It is the account prepared by the account holder. I open one bank account. I prepare my account of my transactions with the bank. How much money I deposited, how much money I withdrew. I write in one book. That is cash book. What is passbook? It is the banker's perspective. Banker prepares one statement for all his transactions with me. That is passbook. So who prepares cash book? Accountant. Who prepares passbook? Banker. When I prepare and when he prepares, same sets of transactions should be there in both. Balance should match. If it doesn't match, we want to know why is it not matching. Sometimes it's one of our mistake. Sometimes it's not our mistake. If there is a mistake, let's rectify. Shall we see the reasons for difference? Very good. The first reason for difference. I have issued a check to my customer. When I give the check to my customer, payment is done. I'll write the journal entry. What to say? Debtor balance is decreasing. Cash balance is decreasing. I gave a check to my creditor. Creditor balance is decreasing. Bank balance is decreasing. I write the entry creditor account debit to bank. Did I write the entry creditor account debit to bank? The moment I write this, my bank balance has reduced. My bank balance has so my bank balance has reduced in my cash book. Banker is sitting somewhere. How does he know that I gave check to my customer? He doesn't know. Because the banker doesn't know, banker has not passed the entry. My bank balance was 1 lakh. I issued a check of 10,000. In my cash book, bank balance became 90. In passbook, bank balance is 1 lakh. They're not matching. That's the reason for difference. What is the reason for difference? Check issued but not deposited, or checks issued and deposited but not cleared. I'll repeat: check issued but not deposited, or checks issued and deposited but not cleared. This is the reason for difference. First reason. Second reason for difference. My customer gave me check. My customer gave me check. I received that check. The moment I received the check, I wrote the journal entry. What is the journal entry that I would write? Bank account debit to that person whoever gave me the check. Bank account debit to debtor. I wrote the entry. I've already written the entry. My bank balance increased in my books, but it's increased only in my books. I have not deposited the check with banker yet. The check is in my hand. My passbook balance won't increase. This is the second reason for difference. What is it? Check received but not deposited, or checks received and deposited but not cleared. Checks received but not deposited, or checks received and deposited but not cleared. Third reason for difference. I have been not waiting for my customer. Customer is calling, I'm not picking the call. Customer tells, come tomorrow, collect cash. I don't go. Customer is so irritated. He wants to pay money, but he doesn't want to keep it waiting. But I am not collecting. What does he do? He directly goes to my bank. He puts the money in my account, tells the banker that increase my bank balance, and he'll go. So what happened with this transaction? My bank balance increased, but I am not aware that my bank balance increased. My bank balance as per passbook has increased, but my bank balance as per cash book has not. My bank balance as per passbook has increased, but my bank balance as per cash book has not. Is this a reason for difference? Yes. This is direct deposit by customer in bank account. What is this? Direct deposit by customer in next one. Fourth one. I am very busy person. Customer hatra cash collect ಮಾಡಕ್ಕೆ ಹೋಗ್ಲಿಲ್ಲ. Will I be worried? Will I be having enough time to make payments? No. I am not able to make payments on time. I'll call my banker and then say, hey banker, please pay my rent, insurance, electricity bill, Amazon Prime and Netflix subscription, YouTube Premium subscription, Spotify subscription, all of this you please pay. I give standing instructions. Banker, no, timely basis, he paid all this money. Now, when he pays this money, does he ask my permission? No, auto pay, auto debit option. Cut, he's paid the money. Whenever he pays the money, he'll reduce my bank balance. I didn't even write journal entry. So passbook balance has come down, cash book balance is not. This is another reason for difference. What is this called as? Payments made by the banker on standing instructions. Payments are made by the banker on standing instructions. Who gave standing instructions? Me. Then, like I asked my banker to make payments on my behalf, I can ask my banker to collect the money also on my behalf. I told my banker, that house is mine. They will pay rent, collect every month. Okay. And that investment is mine. On that interest will come, you collect. I've also invested in these equity shares. They'll give dividend. You please collect. I've given instructions to banker. Banker on a timely basis collects my interest, collects my dividend, collects my salary, collects my rental income. All of these things bank is collecting automatically. Whenever banks collect this money, banker will increase the bank balance, but no entry is made in cash book. Bank balance as per passbook has gone up, bank balance as per cash book has not. Is there a reason for difference? Yes. This is the next reason, which is receipts collected by banker on standing instructions. Receipts collected by banker on against which no entry is made in cash. Next, banker does not give all of these services free. Banker will cut no charges. Will directly cut. He won't even ask. Whenever banker has cut bank charges, ATM charges, SMS charges, internet handling charges, card handling charges, SMS alert charges, so many charges they'll cut. UPI payment transaction charge. When they deduct all of this, because of all this, my bank balance has gone less. Non-maintenance of minimum bank balance charges. I don't have money. You're cutting money for not having money. Weird, no? Charging people because they are poor. So when they do all of this, my bank balance is reducing. They won't ask my permission. Will they come knock my door, tell knock knock joke and then collect money? No, they've done it. So passbook balance has decreased, cash book balance has not. This is another reason for difference. What is it? Bank charges recorded in passbook only. Then banker also has to keep me interested. All of my money is with him. No, if I don't like him, I'll change the bank. So what does the banker do? Hey, don't worry. I am interested in you. To show you my interest in you, I will give you interest. Take bank interest for the money that you kept. That bank interest, they won't come call me, give it to my hand, and then say thank you. No, they put it into my bank account. Whenever they put it into my bank account, my bank balance will increase without even me being aware of the same. So passbook balance will increase without increasing the cash book balance. So this is another reason for difference, that is bank interest credited in passbook only. And I am a human being, I can make mistakes. Banker is a human being, banker can make mistake. If I make mistake, it will appear in cash book. If the banker make mistake, it will appear in passbook. These are all the reasons for differences. When these reasons for differences are there, I have to identify. I have to know every reason why passbook and cashbook is not matching. In these differences, if there is an error, I have to rectify. In these differences, if there is an error, I have to rectify. Let's proceed to see what is it that I should do. When is BRS prepared? When do we prepare BRS? Sir, when the question comes in the exam. Give me an answer other than that. Whenever we want. When there is a difference. Every day there will be difference. Will you do BRS every day? No, sir. BRS can be done whenever you want. You want to do it daily, you can do it daily. You want to do it weekly, you can do it weekly. You want to do it monthly, your choice. Quarterly, annually, it's up to you. But compulsorily, you should do it once a year at least when you're doing balance sheet. If you're doing balance sheet every month, BRS has to happen every month. If you're doing balance sheet every quarter you should do BRS. Why is it that every quarter you should do BRS? What is the reason for doing it? Very simple. When we prepare balance sheet, in the balance sheet we write bank balance. That bank balance should be correct bank balance. If I write wrong bank balance, assets wrong, interpretation wrong, decision wrong. That should not happen. So when the balance sheet is prepared, the bank balance to be shown in the balance sheet should be correct. To show the correct balance, I should check if there is error. If there is error, I will rectify and then only write it. To do that rectification of error, I should check if there is error. To check if there is error, I should identify differently. And this entire process is called bank reconciliation. Understood? Regular intervals, but must and should. Mandatory to be done on balance sheet date. Everybody got this? Nice. Next one. Which balance to show in balance sheet? Which is the correct balance? Balance as per cash book is correct or balance as per passbook is correct? ಯಾವುದು ಎರಡು ಅಲ್ಲ adjusted cash book balance. Balance as per cash book can be wrong. Balance as per passbook can be wrong. We need to find balance as per amended or adjusted cash book. What do you mean by amended or adjusted cash book? I told you no. I'll take cash book. I'll take passbook. I'll keep both of them. This transaction is here. This transaction here, 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 here. I'll find some transactions which are there in passbook, which are not there in cash book. I'll find some transactions which are there in cash book, which are not there in passbook. I will see who is right. I'll see who is right. If there is some error, mistake, I will do that rectification in my cash book. After I do rectification of errors in my cash book, I'll get the amended cash book or adjusted cash book. This amended cash book or adjusted cash book is the correct cash book balance. This amended or adjusted cash book balance should appear in our balance sheet. What balance should we write in balance sheet? Amended or adjusted cash book balance. I hope everybody understood. What is this amendment or adjustment for? This is for differences which are there in BRS which are not timing. Differences which are there in BRS which are not timing. What do you mean timing? Timing means not error. Timing means not error. It is just because of time that there is a difference. If it is non-timing difference, we need to adjust it to find balance as per amended or adjusted cash book. That brings us to the question, what do we mean when we say timing? Timing differences. Shall we see what is timing difference? For example, I have given a check to my supplier. He did not deposit it with bank. I gave the check, I wrote entry in my cash book. Why is it not there in passbook? Because my supplier did not deposit. When my supplier did not deposit, is it my mistake? Is it my mistake? And not my mistake. Not my mistake. You got what I'm trying to tell? Not my mistake. If I made the mistake, he did not deposit. Why should I make rectification? This is timing. Give some time. Give some time. 1 week time, 10 days time, 20 days time. That guy will deposit. Passbook entry will come. Cashbook passbook will match. Got it? Second one. My customer gave me a check. When my customer gave me a check, I should deposit with bank. I have not deposited. It is not mistake. ಟೈಮ್ ಬರಬೇಕು ಅಂತ ಕಾಯ್ತಾ ಇದ್ದೀನಿ ಅಷ್ಟೇ. ಯು ಅಂಡರ್ಸ್ಟ್ಯಾಂಡ್? ಯು ಅಂಡರ್ಸ್ಟ್ಯಾಂಡ್? ನಾನು ಅಂದ್ರೆ ಯಾರು ಚೆಕ್ ಡೆಪಾಸಿಟ್ ಮಾಡದೇ ಇಲ್ದಿರೋ, ಐ ವಿಲ್ ಡೆಪಾಸಿಟ್ ದ ಚೆಕ್ ಇನ್ ಸಮ್ ಟೈಮ್. ಯು ಗೆಟ್ ಇಟ್? ಸೊ ದಿಸ್ ಇಸ್ ಅಗೇನ್ ಟೈಮಿಂಗ್ ಡಿಫರೆನ್ಸ್. ವಾಟ್ ಈಸ್ ದಟ್? ಚೆಕ್ issued but not deposited, check received but not deposited. These are timing differences. If you give little time, difference will go away. What about the third difference that was there? Direct deposit by customer into bank account. This is an error. My customer deposited the money into my bank account. They've entered in passbook. I have to enter in cashbook. If I don't enter in cashbook, this is error of complete error of my customer deposited money. I should record the receipt. Not recorded receipt. Omission error. I have to rectify. That I would write it in my amended cashbook. In BRS, all the differences should not come. BRS is only for timing difference. Timing difference means non-mistake. You cannot do mistake and write in BRS. Are you getting it? Reconciliation is when neither of us have done mistake. When one of us have done mistake, I should tell sorry. I can't say we agree to disagree. Agree to disagree is in a debate. Yeah, when I am wrong, I cannot say I agree to disagree. No, when I am wrong, I should tell sorry, I am wrong. Should have not done. So I am not telling you sorry. He is accepting the sorry shamelessly. Okay, so you understood, no? What are non-timing differences? These are differences between cashbook and passbook other than the reason of time. Meaning these are actually errors in cashbook. Errors in... Let's do this, yeah. You have all these differences, no? Checks received but not deposited, or checks issued but not deposited, direct deposit, all of this. You will tell me whether these are timing or these are non-timing. Shall we play a fun game? Yes, sir. Yeah, checks issued but not deposited, or checks issued, deposited but not cleared. Very good. Why? If not today, tomorrow. If not tomorrow, day after tomorrow. Check will be deposited. Check will get cleared. Balance will match. There's nothing that you have to do for this. Are you getting it? Go to the next one. What if check has been received but not deposited? Timing, non-timing? Timing difference. How about direct deposit by customer into bank account? Non-timing. It's an error on my part. I had to make the entry. If I have not made the entry, it is my mistake. Non-timing difference. This is an error of complete omission. I have to record this in cashbook. Re-identify my cashbook balance. Then only do BRS. Then only do... Yes. In BRS, difference number 1 and 2, can it arise? Yes. Difference number 3, can it be written? No, we should not write difference number 3 in BRS. It should be always written in amended cashbook. But for our exam, if they ask amended cashbook, we will do. If they don't ask amended cashbook, write point number 3 also in BRS only. But don't do that in real life. Point number 3, can it be written in BRS? It should be written in amended cashbook. But when they ask for 5 marks and they don't ask amended cashbook, what to do? Right, clear, finish it. It's absolutely okay. What about payments made by banker? Not standing instructions. Recorded in passbook only. Not recorded in cashbook. I had to record. I did not record. Error of complete omission. Non-timing difference. How about receipts collected by banker on standing instructions? We have not. We should record. We have not recorded. Non-timing difference. These 3 red flags are there. No, they will be written in amended cashbook. Yeah, red flag andre RCB. Il red flag andre ACB. Yeah. ಮಣ್ಣೆ ತಗೋಬೇಕು JCB, ಕಪ್ಪೆ ತಗೋಬೇಕು RCB. Next year also ನೋಡಿ ನಮ್ದೆ ಹೊಡಿತೀವಿ. Next, what? For people who are watching it from what to say, different team in your heart. Yeah, that heart in which you have some other team also is red in color. Huh? Sorry, no offense. You can like any team. I like RCB. Yeah, next one. Bank charges recorded in passbook only. Bank charges should be recorded in passbook and cashbook. No, if you record it in passbook but you don't record in cashbook, it's an error of complete omission, non-timing difference. Then what if bank interest is credited only in passbook? I should record it in cashbook. I have not recorded. Error of complete omission, non-timing difference. Understood? Then eighth one. What about errors in cashbook? There only is there no error. Error, non-timing difference. Understood? Errors in passbook. Because when the banker makes the mistake, no, I can't tell the banker, edodu, chair edodu, jaga padu. I will sit, I will pass entry. Aaj tera bhai entry karega. No, you can't do entries in banker's books. Can you tell the banker, okay, can I make double entry? Your accounting package? They'll scold. No, they'll slap. You can't. You cannot have control over banker. Maximum you can do is you can write a letter. Hi, how are you doing? I came across with this fact that you done deep down mistake in your passbook. Yeah. Everyone does mistake. Even I did one. But I want you to rectify your mistake. After you write that letter, yours lovingly, and then after writing all that, just have to wait for them to rectify. Correct? No, after it, you can only wait. No, what else can you do? The application given, pending allotment, you wait. Once they rectify, it will be sorted. So there's nothing that you can do to rectify that mistake. I hope you got it. So error in passbook is a timing difference. So only three things can appear actually in BRS. What are they? Checks issued but not cleared, checks received but not cleared, and errors in passbook. Rest all of them are actually amendment to be done in the amended cash. So what is the process? Sir, can we start with passbook balance or can we start with cash book balance? Listen, we have prepared cash book. They have prepared passbook. Who should do who should do bank reconciliation statement? They are least interested. Banker is not going to help you do amendment cash book, or banker is not going to help you do PRS. ನಮಗೆ ಬೇಕಾಗಿರೋದು, we have balance as per cash book. We want to check whether this is right. So we do BRS. When we do BRS, always BRS has to start with balance as per cash book. Always BRS has to start with balance as per cash book. You do add, you do less, whatever you want to do, you do. And then at the end you find balance as per passbook. No, you are not finding it. It's already there. Usually in reality, what will happen? Cash book, passbook, both will be there. You find the difference. But ICAI loves it. They'll give cash book, they'll give difference. You find passbook. Wow. You understand? So that's not how it's going to be in reality. Passbook, cash book will be available. You find difference. In a very rare situation, in the question, if they don't give cash book balance, then you will start with passbook. If they don't give cash book balance, then you start with. When the cash book, passbook both are available, you start with. When only passbook is available, you start with. If only cash book is available, you start with. I hope you got it. And which one should you do first? Amended cash book or BRS? Amended cash book. First open amended cash book. I'm going to say BRS before amended cash book just to make you understand. Should open amended cash book. In that, write balance brought down. Write all the error rectification. Receipt not recorded. Receipt side, debit side. Payment not recorded. Payment side, credit side. Once you write it, you'll find the balance carried on. That is balance as per amended cash book. That balance as per amended cash book will be recorded in BRS and you prepare BRS. I hope you understood. Say something. Very good. If you closely observe, it's nothing but rectification of errors. Try to see the same chapter, this chapter from that angle also. Last question, which balance should you show in the balance sheet? Balance as per cash book or balance as per passbook? Balance as per amended cash book. Just to tell you what had happened in that September 25 examination question, they had given you balance as per passbook and they asked you to do amended cash book. What do? First start with balance as per passbook. Do all add less. You will find balance as per cash book. By that balance as per cash book, you write. Use all the differences and then identify how much is non-timing or what is timing. Write all the non-timing differences and find the balance as per amended cash book. Using that balance as per amended cash book, then prepare PRS. Oh. What? 5 marks? 5 marks. Accounts exam. You are doing everything for marks or not? Now, when we teach one topic class, sir, how many marks from this chapter? Let's say this chapter can come for 5 to 10%. If I tell that, they're like, okay, sir, 10%, I'll skip this. 124, I'll score 114. 124 marks, no foundation exam. If you tell you score 114 and then you prepare and then study, when the client comes, sorry sir, I left that chapter for 10 marks. Can you tell that to your client? Just imagine a doctor in the operation theater telling you, this wire, no, I forgot. What is this? I skipped that concept. That page I skipped. Can what if a doctor tells that? Then you'll be like, "Ta-na-na, ta-na-na, ta-na-na-na-na-na." Husky dance in the operation theater. Remember, you are becoming an accounting professional. You are not trying to pass one exam. It's not become like you passing marks card or marks. No, you're going to become a professional and you're judged. You're being judged whether you can be a professional or not. Don't keep marks in mind when you study. If you study keeping marks in mind, if you study looking at the clock, then you have to check your wallet when you spend. Study without looking at the clock. Study without looking at the marks. One day when you start spending, you don't have to see the wallet. You can go on spending. Oh, see. Mid marathon motivation. Time for us to upgrade into chapter 4 valuation of inventories. Focus on the topic of valuation of inventories now. In this topic, what are we trying to do? We have inventory. Inventory means stock in any form, raw material, work in progress, finished goods, whatever you have, you want to assign some value to it. Only when you assign some value, you can write it in books of accounts. You can't write no inventory in balance sheet asset side. Is to. Opening is to, closing is to, consume is to. You can't write is to, itna, utna, you can't write. You have to write some value. How to value? That's what we're learning in this chapter. When you say valuation, what do we mean? After you write your test, your papers will be valued. No. You wrote 4-line answer. Teacher will write 1 mark. That is valuation. Here, looking at the inventory, you assign some number. Here, number is money in rupees. Valuation means representation in terms of money. Of what? Inventory. Inventory means stock. Stock means raw material, work in progress, finished goods. For our example, let's take I have manufacturer of a merchandise product for what to say widely viral travel vlogger. Wildly viral travel vlogger. Vlogger. Who? No, no. Okay, I make shirts and then all of this. We say all travel merchandise. I buy finished, I sell finished goods, which is like a shirt. And then I make that shirt using the thread. That thread comes from cotton. So I buy cotton, I make it into thread, I weave it into shirt. Ta-da! Travel vlogger, viral, famous, pink color, Dora the Explorer. This shirt, what I sell is finished goods. This is finished goods. To make the shirt, I need thread. I buy cotton, make it into thread, weave it into cloth, cut it into shirt. So stitch it into shirt. At the thread stage, it is WIP. At the shirt stage, it is finished goods. At the cotton stage, when I buy, it is raw material. This is not that. This is cotton. There is white color around it. You see that? Not just the leaf. See, there is cotton. This is cotton plant. Are you getting it? Yeah, some people are like, hey, idu. No, not that. Not that. Allah. Yeah, idu adu Allah. So, what is raw material? For consumption, sir. No, not that. Consumption in making thread, weaving it into cloth, cutting, stitching it into shirt. Consumption in the production of goods or services. What do you mean by WIP? Which is in the process of production for such sale. Finished goods, which is kept in the ordinary course of business for sale. Anyone who wants the shirt can please contact me after class. Sorry, I don't sell. I'm just telling you. So it will also include raw material will also include supplies and consumables. What is supplies and consumables? What is the color of the cotton? What is the color of the shirt? How did it become pink? I put dye. You call it dye, ink. That ink what I put is also raw material. On that shirt I put one button. Raw material included, treated like inventory only. T-shirt. Oh, t-shirt button ಇಲ್ಲ ಅಂತಲ್ಲ. I make shirt also. White color shirt with Dora logo here. Madi sir, who will buy? Nobody will buy. I know you want me to dissolve my partnership firm. We'll come there eventually. Dissolution of partnership and dissolution of partnership firm. Next, so value at which inventory to be recorded in our financial statements is the objective of this entire chapter. There is inventory, I want to assign some value. Why is it important? Because if we don't assign the right value to the inventory, our financial statements income will be damaged. I'll explain you how. If you don't show right value of inventory, you will not get right profit. You know GP formula can be found in two ways: sales minus cost. Am I right? Where cost of goods sold is found as opening stock plus purchase plus direct expense minus closing stock. In this closing stock, if it is wrong, COGS will be wrong. If COGS is wrong, GP is wrong. If GP is wrong, NP is wrong. If NP is wrong, profitability analysis is wrong. If profitability analysis is wrong, decision making is wrong. So closing stock is very important. You got it? Dominoes effect. Or we'll see trading account. You know how to prepare trading account? Debit side, credit side. What do you write on debit side? Opening stock purchases. Am I right? Purchases less purchase returns. Direct expenses if there is any. Credit side you write sales. Credit side you write closing stock. Sales minus sales return, closing stock. Then we find total of closing stock. Write the same thing to debit side. Then we'll find GP. If I write closing stock wrong, total on the credit side will change. If the total on the credit side change, total on the debit side will change. Total on the debit side change, GP will change. Do you understand the potential point here? For example, these are the numbers that I have. Help me with GP. Come on, take your calculator. 1 lakh 25 on the credit. 1 lakh 25 minus 55. 70. You got this? Now let me change the closing stock a little. Instead of 25, let me make it 30. Then what will happen? Credit side total will become 1 lakh 30. Debit side total will become 1 lakh 30. GP will become 75. Did you understand? With change in closing stock, GP changed. With increase in closing stock, GP increased. With increase in closing stock, GP 25 play and decrease my closing stock. Instead of making 25 as 30, I'll make 25 as 20. Then closing on the credit side will become 1 lakh 20. Debit side will become 1 lakh 20. 1 lakh 20 minus 55. So can I say if closing stock increases, profit increases. If closing stock decreases, profit decreases. Can I? So wrong closing stock, wrong profit. If they do the error, we'd have to do rectification. Half of your valuation of inventory chapter is also rectification of errors. Second part wherein you do the reconciliation table which looks like BRS, that part is actually rectification. You do rectification of errors, rectification other than cash book errors and other than inventory errors. Inventory errors are specifically rectified in valuation of inventory chapter. And here you do in BRS, you do rectification of cash book. And in final accounts of sole proprietor, anyways, you've seen so many rectification of errors. Incomplete records, so full book errors only. In partnership accounts also, you see in that car problem, that problem, this problem, where there are errors and you rectify. Are you getting it? So rectification is there throughout in every aspect. And some of you will decide boldly, I'll skip rectification. Bold move, bold move. Yes, focus on rectification also. Okay, now this morning, you had Chitran as breakfast. What does this mean? Last night, rice was left out. Can I say previous night's rice will become this morning's breakfast? Yes. Using this logic, I can tell previous year's closing stock will become current year's opening stock. Current year's closing stock will become next year's opening stock. Do you agree with me? Same way, if your closing stock is wrong last year's profit went wrong. Sir, beautiful idea, no sir, like this will increase closing stock, profit will increase. No. If you increase last year closing stock, last year profit will increase. That will result in increased opening stock this year and it will decrease current year profit. How? Let's check. Imagine same numbers. How much is GP? 1 lakh 25 minus this 70. Now I'll change my opening stock. Instead of 10, I'll make it 15. What will happen? Total will be 1 lakh 25. 1 lakh 25 minus 45 and 15. GP will become 65. See, last year when I increased my closing stock by 5,000, last year my GP increased by 5,000. Because last year's closing stock went up, this year's opening stock went up. and this year's GP fell down by 5,000. You understand? So with increase in the opening stock, GP will fall. What if I decrease my opening stock from 10 to 5? My GP will increase. So can I say opening stock increase, GP decrease, and opening stock decrease, GP increase. See this? What will happen when closing stock increases? Profit increases. When the closing stock decreases, when opening stock increases, when opening stock decreases, how to remember this? Very simple. Do you know the movie Om Shanti Om? Do you know the song Om Shanti Om? All cool boys, come on, make some noise and say. Ade, Om Shanti Om is a song where a lot of actors keep coming in. When lot of actors keep coming in, no, they won't come free. You pay them money. So Om Shanti Om, too many actors, too much payment, less profit. When too many actors come in one song, you pay so many people, profit will decrease. Am I right? Same logic. OSO, opening stock when it is overvalued, profit will decrease. Opening stock when it is overvalued, profit will. What if opening stock is undervalued? Profit will increase. What if closing stock is overvalued? Profit will increase. What if closing stock is undervalued? Profit will decrease. When you get one, you get all others right. When you get one, you get all others right. It's all change, change, change. Two changes means double change. I hope you got it. Very nice. Then after this, you would have to practice some problems on this. Anyways, we'll do some questions little later. Then ascertaining the financial position. Closing stock will appear in balance sheet also. It's an asset. It will appear in P&L to determine our income. It will appear in balance sheet to identify our assets. If you write wrong closing stock in the balance sheet also will look incorrect. So writing correct closing stock in P&L is important to find correct profit. Writing correct closing stock in balance sheet is important to find correct financial position. Next thing that I want you to note is with regard to accounting standard. Yeah, statutory compliance. You have to mandatorily comply accounting standard 2 in valuation of your inventory. Accounting standard 2, is it an accounting policy or is it an accounting estimate? Yes, I've already taught this to you and we did chapter 1. Come on, what is your estimate? What is your estimate? Shabash, it is policy, it is not estimate. FIFO, LIFO, SAM, WAM are all accounting policies. As per para 5 of accounting standard 2. Para 5 of accounting standard 2. Inventory should be valued at cost or net realizable value, whichever is. Very good. Why? Conservative approach. You buy something for 100. You are expecting to sell it at 120. Do you make profit or do you make loss? I'll repeat. You bought something for 100. You are expecting to sell it at 120. Do you make profit or do you make loss? Profit. Wait, Madi. Don't record. When will you record? When you sell. When you sell it at 120, that day you book 20 rupees profit. You bought some inventory at 100. In the market, no, price is 90. Loss. Will you make loss now? No. You'll make loss when you sell. But record it now only. Why? Conservatism. If you expect expense or loss, account for all expected expenses and losses, but not for expected incomes and gains. If you expect to sell the inventory at a higher rate, don't book the profit. Wait till you actually sell. If you expect loss, book it now. When you expect only, you book the full loss. Understood this? That's the reason we value the inventory at cost or NRV, whichever is less. When we do this cost or NRV, whichever is less, no, do it item wise. Do it not total. If there are 5 inventory items, 5 items cost, 5 items NRV is given. Total cost, total NRV, if you do, totally you will take one more attempt. What should you do? Individually, cost NRV, whichever is less, cost NRV, whichever is less, cost NRV, whichever is less. Total of whichever is less is what you should do to write it in the balance sheet as well as in your trading account. I hope you got it. Then what and all will cost include? Cost of purchase, cost of conversion, and directly attributable expenditure incurred to bring the inventory to its present location and condition. Let's say you are a manufacturer. You don't buy finished goods. You don't buy shirt. You don't sell shirt. You buy cotton. You sell shirt. You buy cotton. You sell shirt. When you buy cotton and sell shirt, that conversion process is there, no? That is also part of the cost. Purchase price of cotton is there, no? That is also part of the cost. Any expenditure incurred till the time the inventory is ready to sell, it's included in the cost. I hope everybody understood. That purchase price, should it include taxes? GST paid, on purchase of cotton. It's not there, but let's say you paid some GST. Is it included? Not included. You would have to ask. You would have to ask, is it recoverable? Is it not recoverable? Is input tax credit available? Is input tax credit not available? If input tax credit is available, don't include GST. You bought raw material for 100 rupees, paid 10 rupees GST. So totally you paid 110. Should you write cost of inventory as 110 or 100? Depends. If input tax credit available, record 100. If input tax credit not available, record 110. I hope you understood. Very nice. Come on, let's go forward. After this, you take amount paid or payable to sender. Duties and taxes other than which are recoverable should be included. Freight inwards will be added. Trade discount, if it is there, you should deduct it. Then cost of conversion and all, you know, the cost expenditure incurred to convert raw material to finished goods, and any expenditure that is incurred to bring it to its present location and condition. 2 points to importantly discuss. Normal loss. What is the treatment? Normal loss. Normal loss means unavoidable loss. You can't avoid it. No matter what you do, the loss will happen. What to do with that? It should be adjusted only in unit column. Should not adjust amount column. Are you getting it? Let's say you bought 100 units. You bought 10 units got damaged. And it is normal. 10 units get damaged. You have only 90. So what do? 100 units bought at rupees 10,000. 10 units normal loss. From 100 units you deduct 10. Number of units become 90. Amount will be 1000. 1000 will be the value of 90 units. 1000 by 90 you will get 10.10 or something. How much? 10.10. Per unit cost will increase from 10 to 10.1. If there is normal loss, you will adjust it only in units column. Are you getting it? What is normal loss? Unavoidable loss. You can't stop that loss. That loss will happen. What is avoidable loss? This you can stop. You can restrict. With some necessary action, you can restrict. Are you getting it? Let's say you bought 100 kgs of tomatoes. How many kgs of tomatoes? When you buy 100 kgs, no. In the truck, when you load 100 kgs, bottom one 10 kgs are there. No, they get squashed. They get squashed. That will become jam before it reaches the factory. ನಮ್ದೇನ್ ಫ್ಯಾಕ್ಟ್ರಿ ಟೊಮ್ಯಾಟೊ ತಗೊಂಡು ಜಾಮ್ ಮಾಡ್ತೀವಿ, ಸಾಸ್ ಮಾಡ್ತೀವಿ. But the 10 kg got sauce there only. There only I can take and then put it into one bottle like this and then see, no. So I bought 100 kgs of tomatoes. Each kg at 50 rupees. 100 into 50? Really? 500. Very good. 100 into 50? 5,000. Now, how many kgs got destroyed because of that weight? 10 kgs. So, 5,000 is the value. 5,000 is the value, but not for 100 kgs. 90 kgs. Do 5,000 by 90? 50? 55.5 is the cost per kg now. Are you getting it? This is normal loss treatment. This is because that bottom 10 kgs you can't stop. How do you stop that bottom 10 kgs loss? Simple, sir. That bottom 10 kgs you take and put it on the top. Hey, Allah, but something else will come. That also you take and put it on the top. Something has to be there at the bottom. No, sir. We'll put one. Let's say one slab of wood on that. We'll put nothing at the bottom. Then also that weight will be there. No. Are you getting it? Inappa? Bed put a bed mere. Hey, avaga bed ella red color agataste. Weight will anyways be still there. No. So it is unavoidable loss. But let's say some tomatoes are jumping at the signal when, so not in the signal, when the speed breaker, when the truck goes like this, 2 kgs will jump and fall outside. In the signal when you stop, auntie in the scooter below, 1 kg tomato rasam ivattu, 1 kg. Or when you stop in front, below the tree, no, one kaka will be like, ka, tomato. Like this, you lost some 10 kgs. Can this be avoided? Yeah. This is avoidable loss. This is, you bought 100 kgs. Okay, there is no room for abnormal loss. Normal loss is 10 kgs. How much is our normal loss? But actually loss is 15 kgs. Actually loss is 10 kgs you will deduct in units. 100 minus 10, 90, 5,000, 55.5 you do. Abnormal loss of 5 kgs, I will deduct in units. For each 5 kg units, no, you will multiply 50 by 55.5. You write the value and you deduct it. So after abnormal loss, per unit cost will remain same. After normal loss, per unit cost will shoot up. After abnormal loss, per unit cost will remain same. Understood? After abnormal loss, per unit cost will remain Same. After normal loss, per unit cost will shoot up. Are you getting it? So that amount of abnormal loss will be charged to P&L. That's one thing that I wanted you to note. In a regular class, we do this much in detail, storage cost, interest, and all of this. But Ippo Venda, yeah, marathon class illa. Okay. Let's go to the next point. We have understood cost. NRV. This is not detailed, required in detail. This much we will know. What do you mean by NRV? Net realizable value. Realizable value means if I sell today, what I'll receive is realizable value. Why do we call it net? We'll call it net because what if in the process of selling we'll incur some expense to sell? If we incur some expense to sell, that expense that you incur to sell will be deducted. Expected realizable value 10,000. To make it sold at 10,000, you have to incur 100 rupees commission. 10,000 sale price less selling expenses 100. 9,900 is NRV. How do you find NRV, net realizable value? From the sale price, we deduct selling expenses. From sale price, we deduct, and that's how we find net realizable value. This can be transportation, this can be brokerage, commission, or any other customization charges, all of this. I hope everybody got this. By this, we are done with the valuation part. Then, what I would want you to know is this has to be applied item wise and not in total. Now, let's go to the next point. Liquidity analysis. Inventory at what value can we liquidate is also a very important point. That's another theory point to be noted. So significance is how many points? Significance is 4. Determination of income, ascertainment of financial position, statutory compliance, liquidity analysis. I hope you got that. What are the methods that we have to determine inventory value? Depends on the fact whether the inventory is ordinarily interchangeable or not ordinarily interchangeable. Depends upon the fact whether inventory is ordinarily interchangeable or not ordinarily. What do you mean by ordinarily interchangeable? Ordinarily interchangeable means one product can be replaced with another product like this. For example, I went to buy this cup, this tea cup. No, there are hundreds of this tea cup. Same product, same brand, same print. If I ask, he'll give 100. So if this is there, this can be replaced by one more. It's the same. You go to buy shirt, you go to Max, you go to Reliance Fresh. What is it? Reliance Trends. You go to Studio, you go to Zara, you buy, you see one shirt, one rack, same shirt, there are 20 shirts behind it. All the shirts same price, no. One shirt, another shirt, same purpose. It can be replaced with another. First shirt is 800 rupees. Second shirt is also 800. One can be replaced with another. Ordinarily interchangeable. Second category. First category, not ordinarily interchangeable. What is not ordinarily interchangeable? One cannot be replaced with another very easily. Let's say I get one bottle customized. I want this kind of yellow only. I can this kind of teal blue only. Not more, not less. If you get it customized, if you like, I want this logo on this, or you get one golden jewelry. Jewelry when you buy, each unit has different weight. Each unit has different design. Now, okay, if you go to one our that jewelry shop, that uncle is on Lalita Jewelry, if you go, you get one set of rings. There are 10 rings. You ask them the price of one ring. How will they tell? They'll take the ring and they'll open one box. In that, there'll be one weighing scale. They'll keep it, they'll close it, they'll press the button. Weight will come. Then they'll take the calculator, type the weight, multiply. You'll see there. They would have put no today's per gram rate. Multiply with that. Then look at my face, add wastage. Correct? No. Then they'll say, sir, this much. They'll take a print and then give. This is the price. Making charge. They'll add. And then they'll give this is the price. I'll say, not this ring, sir. Other pakdal irodu. Entire process repeat. Take the ring, keep it in the weighing scale, check the weight, take calculator, weight, rate, wastage, service charge, making charge, and then bill. So no two rings the price is same. Every ring the price is different. Why? Because it is not ordinarily interchangeable. One unit cannot be replaced with another unit. You go to that drum they sell, no? What is that shop? Yeah. Allah, old Yeshas Academy in that curve signal. Manyavar, ground floor, red color and all this big they keep, no. You people wear in weddings. Lehenga. So when you buy that lehenga, hey, Adishdappa inge can't even fold. I don't know where will they keep at home. So you are laughing, no? I will give you a surprise now. Can you guys tell me how much is the cost of one lehenga? Manyavar, if you go buy one lehenga, starting price. ಹುಡುಗ ಹೇಳ್ತವ್ರೆ ಆಯ್ತು ಅಕ್ಕ got married recently or something. No, 1 year back. So he knows. Rest of you get ready. When you get married, you will have to buy it for your wife. So study, pass exam quick. ಏನಪ್ಪ ನಿನ್ ಹೆಂಡತಿಗೆ ನೀನ್ ತಾನೇ ಕೊಡಿಸ್ಬೇಕು, ಅವರೇ ತಗೋಬೇಕು ಅಂತ ಹೇಳಿದ್ರೆ. If you are of this attitude that your wife should buy clothes for herself, no. ಯಾರಿದೆ ಅಂದರೂನು ಈ ಸಿಂಗರಲ್ಲವ. ಹುಷಾರು, you should be ready. Earn well. Why do they marry chartered accountant? ತಿಂಗಳಿಗೊಂದ್ಸತಿ ಚೈನು, ವರ್ಷಕ್ಕೊಂದ್ಸತಿ ಇಂಟರ್ನ್ಯಾಷನಲ್ ಟ್ರಿಪ್, ಬೇಕಾದಾಗ ಲೆಹಂಗಾ, ಸಿಲ್ಕ್ ಸಾರಿ ಎಲ್ಲ ಆಗುತ್ತೆ. ಬಿ ರೆಡಿ. ಅರ್ನ್ ವೆಲ್, ಸ್ಪೆಂಡ್ ವೆಲ್. Oh my God. Yeah, earn so well that you can have a walk-in wardrobe in your home. Okay, come back here. Come back here. So they charge so expensive, no? Why? If you ask them why, what is this? This is a designer wear. Designer has designed it. If you say same thing I want to, they'll say it's not there. Each of them is different. It takes different amount of inventory, I would say raw material, different labor, different skill, different designer. So each of its design is different. Each of its price is different. Because men, you wear one black color t-shirt with brown color stripe here and then come, somebody else wears one black color shirt with brown color stripe, but they're like, hey bro, same shirt, where did you buy it? 199, 199. You feel so happy. You feel so happy when someone is wearing the same shirt, guys. But if a girl is wearing a shirt, if she comes here, if she sees somebody else wearing the same thing, she will hate that person for life. You don't like it when somebody wears the same thing. Honestly, see, gottilla nodi nimge. Okay, only place where all women wear same clothes and they're happy is Indian cricket team. That's the only place. Oh God. Okay, listen. Come back here. So, inventory has to be classified into two categories. One, ordinarily interchangeable. Two, not ordinarily interchangeable. You can change one unit of inventory with another unit of inventory easily. It is ordinarily interchangeable. Then you can find value of one unit, multiply with number of units. You can find value of one unit, multiply with number of units. That will be the value of the stock. However, if it is not ordinarily interchangeable, like a designer piece of wear, or what do you say, ornaments that you wear, illi, and then like this, all of that. When you wear all this jewelry, no, value of each piece of jewelry has to be identified separately. You can't find the value of one unit and multiply with number of units. Can you do it? No. Do you understand? When it is not ordinarily interchangeable, only one method, SIM, specific identification method. Specific. What if you can ordinarily change the value of each inventory unit, ordinarily change the one unit with another, and it's all the same. It has no separate significance. It's not customized. Then considering historical cost, you can follow FIFO, LIFO, SAM, WAM. Without considering historical cost, you have adjusted selling price method and retail price method. You understood? So many methods are available. And you don't usually have questions on specific identification method. If it's there, also very easy. They'll tell how much raw material, how much labor, how much expense, add them all, you will get the value of inventory. Under FIFO, LIFO, SAMVAM, what do? Entire class, one unit value, if you know, multiply with number of units, you will get the value of total closing stock. Remember, as per accounting standard 2, for not ordinarily interchangeable inventory, you follow specific identification method. For ordinarily interchangeable inventory, you follow FIFO or VAP. You follow first in first out method or weighted average method. You cannot follow last in first out. You cannot follow simple average method. Adjusted selling price method is followed when the volume of the inventories are huge. FMCG sector or somewhere where volume is high, value is less. I'll deal with 10,000 units, 20,000 units, 30,000 units. Each unit 5 rupees. It's too less, no? For us to identify specifically, maintain one stock ledger, right? Info, input to receipt to payment to closing balance. Too irritating. So, you know what do? We know value for one unit, selling price. Count number of units. 10,000 units multiplied by 5 rupees. 50,000 is the selling price. We know profit margin, 30% profit margin. Deduct 30% profit, you will get cost. Is it effective? No. Is it efficient? No. Does it serve the purpose? Yes. When do we follow adjusted selling price method? When volume is high, value per unit is less. It is very difficult to do stock ledger. Then what do? We will find the selling price of the inventory. We'll find the selling price of the once we find selling price of the inventory, from that we deduct the fixed profit margin. Once we deduct the fixed profit margin, we get the cost. Do you get this? Under FIFO, what do we do? Whatever inventory comes first will be issued first. I have opening stock and purchases. When I sell, I'll assume that the first sales is out of opening stock. Then only it's of purchases. What is this? First in, first out. What do I do in last in, first out? I'll first sell off the most recent purchase. Then I'll sell from the opening stock. Unfortunately, in CA foundation examination, LIFO was also asked in the exam once. LIFO can also come in the exam. But it's not practically possible in our country to follow last in, first out. Simple average, what do? We ignore number of units. We ignore, we'll take rate 1 plus rate 2 divided by, we bought 100 units at rupees 10. We bought 1 unit at rupee 11. What do? 10 plus 11 divided by 2. But that's not correct. What should we do? We should apply weighted average. We should do 100 units at 100. 1 unit at 11, 11. 100 and 100 into 10,000 plus 11 divided by 11 units. Sorry, 101 units. So we should take x into f. Summation fx divided by capital N or summation f. Are you getting it? You can't give significance only to rate. You should also give significance to number of units. It's like doing this way. Let's say we conduct one test to the entire class. Okay, 100 students are there in the class. 99 students scored 100. Only one student scored 0 marks. One student scored 0. And 99 people scored 100 on 100. Can I say 100 plus 0 divided by 2? Classroom performance average is 50. Is it right? No. I should do 99 into 100. One student into 0 divided by 100 students. Do you agree with me? Say something. That's the right way of identifying the average. You should not just give significance to rate, you should also give significance to units. That is weighted average method. Weighted average method. I hope you got it. The recording that is made in our inventory system can be under two methods. One, periodic. Two, perpetual. One, two, perpetual means what? Perpetual is proper scientific record. Every time inventory comes, I will record. Every time inventory goes, I will record. What date, how many units, at what rate, I will record. You prepare that stock ledger, no? Receipts, issue, balance, each date. That is perpetual inventory system. This is time taking. Every day you should come to job. Every day you should see inventories coming or going. Every time you should make entry. Who will do? You are lazy. What do? Don't make any entry like this. Leave. Relax. Periodic system. What do you do under periodic? Last year closing stock you computed? No. Last year did you compute closing stock? So you know opening stock for this year. During there you made payment to suppliers. You know total purchase value. Customers paid you money. You know sales value. And on that sales, you know profit percentage also. From sales, you deduct profit percentage. You get cost of goods sold. Cost of goods sold is opening plus purchase minus closing. How do you find cost of goods sold? Opening plus purchase minus closing. You know cost of goods sold. Sales minus profit. You know last year's closing which became opening. Purchase you got to know based on the payment. Sales you got to know based on the receipt. You find closing stock as balancing figure. That is periodic system. I'll repeat. How do you find under perpetual system? You maintain detailed ledger. Opening 1st of April, these many units, this much rate, this value. On 2nd of April, we purchased these many units at this rate, this value. 5th of April, we issued these many units at this rate, this value. You deduct, you find the closing balance. What is that? Perpetual. You do the table. What do you do under periodic? No table, nothing. Last year, you know closing stock. This year, that will be opening stock. Purchases, how will you find? Payments made to suppliers. Sales, how will you find? Collection from customers. So you know opening stock, you know purchases, you know sales. You know profit percentage. From sales, if you deduct profit, we'll get COGS. COGS is opening plus purchase minus closing. You know COGS, you know opening, you know purchases. We'll find closing stock as balancing ಹೊಸ ಬ್ಯಾಟ್ರಿ ಹಾಕ್ರೆ ನೆಕ್ಸ್ಟ್ 5 ಅವರ್ ಮಾಡ್ಬೋದಿನ We'll wind up once we finish inventory. Check, 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 check. Time is 7:42. Didn't realize. Oh my God, Karthik! Oh, ಸತ್ರೆ ನೀನೇ ಕಾರಣ ಹೇಳ್ತಾ ಇದ್ದೀನಿ. It's killing me. ಕೊಲ್ಲೆ ನನ್ನನ್ನೇ. Okay, you understood periodic? So, who follows periodic? Who follows perpetual? It's their choice. If the entity can maintain records, if it has skill, if it has manpower, if it can track, perpetual. If it cannot, then periodic. Actually, periodic, whatever we do in our books is full bakwas. Actually, if you have to do periodic, you would have to do go check the value of the inventory and straight away record it. We do perpetual only in the form of equation and then call it periodic. Sad. But you understood the difference between periodic and perpetual? They can ask theory question. Difference between periodic and perpetual in the exam. Be ready. Difference between questions also can come. Then let's go to the next one. Next is stock reconciliation. Before that, adjusted selling price method. You understand adjusted selling price method? What is adjusted selling price? Look at the name. What does the name say? Adjust the selling price. Selling price is there. You adjust it to find cost price. You adjust it to find. How do we do? Very simple. Go to the stock. Check your closing stock. You'll find the closing stock at selling price. From that you deduct profit. You'll get cost price. Go to the shop. Check the closing stock. Closing stock you will know at selling price. Deduct the profit. You will get cost price. How to find closing stock? Very simple. You had 10,000 worth of inventory. You purchased 15,000 worth of inventory. You sold 20,000 worth of inventory. 10 plus 15, 25. In 25, if you sell 10, what is remaining? 5,000. Opening is 10,000. Purchase is 15,000. Together 25, no? Out of 25, if you sold 20,000, what is remaining? 5,000. And they'll tell cost and selling price comparison, they'll give it some value. Cross multiply to find the cost. Cost, you cross multiply and you will find. There are two cute questions on this. Please, two cute and two cute alla. Two questions which are cute, which is there in the material. Try that. You will get to know. It's not that very difficult. Okay. But questions can come on adjusted selling price method also. Be ready. Then later, after this stock reconciliation. See, stock is an event. We discussed it in the beginning when we did transaction and event. Stock is an event or a transaction. Purchase is a transaction. Sale is a transaction. Left out closing stock is event. And event you will not find. Looking at purchase account and looking at sales account, you can't find the amount of closing stock. How do you have to find? You should go to the go down, open the shutter, count how much inventory is there in the go down. Are you getting it? Yes. That counting when you are about to do, it's a problem. You cannot count on the exact same day. When do you prepare your balance sheet? 31st of March. On what date do you want to know the inventory? On 31st of March. But for hundreds of reasons, you might not be able to count on 31st March. You will say, I have fever that day, I can't count. You might do some overaction and then you say you can't count on 31st March. Say, sir, 31st March is Sundays, I have to go out. You can't count. For these reasons, you might say that you will count not on 31st March. You might count on 25th March. You might count on 5th April. Can I prepare balance sheet as on 31st March but write inventory as on 25th March? No. Can I write balance sheet as on 31st March and write inventory as on 5th April? No. If the balance sheet is made on 31st of March, inventory should be as on 31st of March. If I can count the inventory on 31st of March, no problem. If I cannot count the inventory on 31st of March, what should I do? What should I do? I should rectify, I should reconcile to find the value as on 31st March. Let's take easy one first. Let's say I counted the inventory on 25th March. When did I count the inventory? Let's take it as before year end. Before year end. Year ending is 31st March. I counted the inventory on 25th March. I want to find the inventory on 31st of March. What do I do? 25th I'll go. I'll count the inventory. I'll come to my office. And then I'll call the client and ask, give me details of what happened in your shop from 26th to 31st. Hey, ಹೇಳಮ್ಮ ಏನಾಯ್ತು ಆಮೇಲೆ 26 ಇಂದ 31st ವರೆಗೂ. They'll give list of transactions. This I purchased, this I sold. 25th March inventory plus purchases between 26th and 31st minus sales between 26th and 31st. Closing stock is there. Easy. But when you deduct sales, it should be at cost. Cost of sold. Write sales in inner column. Deduct profit and then write. What if I count the inventory not on 25th March, but I count it on 5th April? I need to come back in time. When I go from 25th to 30th, I add purchases, I deduct sales. Now when I come from 5th April to 31st March, ulta. I will add sales, deduct purchase. I will deduct sales should be added at cost. Purchase is anyways at cost. You understood? Same thing. Observe, if it is after year end, meaning 31st of March is the year end. When did I count? 5th April. Mistake. What do I do? Start from stock as on 5th April. Less inflow of goods, that is purchase, less purchase return. Add outflow of goods, sales, less sales return, less profit. Does this make sense?
Yes, sir.
Is this very fast? Usually I add purchase, deduct sales. This is backward. So what do? I deduct sales. Sorry, I deduct purchase. I add sales because it is backward. Let's see. What if it is forward? Meaning I counted the inventory on 25th of March. I want to know the inventory on 31st of March. What to do in this case? Very simple. Start with 25th March. 25th March to 31st March. Whatever purchase is there, net of purchase return, add. Whatever sales less sales return, deduct. Profit cost. Then I'll get closing stock as on 31st of March. This is what is to be done. Sir, that goods sent on return or approval and consignment, that is error rectification. That is, this is error of omission. That is error of commission or something like that. Wrong items included or principal error. Sir, why? Very simple, yeah. When they say goods sent on return or approval basis, you gave goods to somebody. Did you sell or did you send? Send. Have you sold it? No. The godown in which the inventory is there is not yours. Let's say on 2nd of April, you sent the inventory. 2nd of April, you sent the to whom? To one customer. Did you sell? We have only sent. 5th of April. 5th of inventory belongs to whom? Us only. But is it in our godown? When we come to our godown, count inventory. We have counted what is there in our godown. We have not counted what is there in our customer's godown. If it is sold, no problem. It is not sold. It is only taking shelter in their godown. But it is mine. What should I do? Add. How much should I add? Whatever is there in their godown minus profit, I should add. Sir, it's not this simple, sir. It's complicated. It is not complicated. It is simple only. 2nd of April, you sent, no? 10,000 worth of inventory you sent. Am I right? 5th of April, you are counting. Before 5th, 4,000 he returned. How much did you send? How much did he return? 10 you sent? No. 4 he returned. How much is in his godown? When did you count in your godown? 5th. 5th of April, when you count in your godown, 4,000 has already come back. It's already counted because it's there in your godown. How much is there in your customer's godown? How much belongs to you? 6 should be added after removing profit. That's it, adjustment. There is nothing fancy. Simple concept. Let's do again. What is it? Goods sent on return or approval basis. Is it sold or sent? Does it belong to you or your customer? When does it belong to him? When he accepts it or when the time lapses? When he accepts it or when the time, if he doesn't accept and if the time has not lapsed, it belongs to us. But it is in his godown. When I counted the inventory in my godown, I have not included the inventory which belongs to me, but it is in my customer's godown. How do I add it? At cost price. If a part of it has already come back, it's already included when I count it physically. So I don't have to add it again. I should only include such inventory what belongs to me, but it is with them. I'll only add such inventory which belongs to me, but it is with them. Are you getting it? Sometimes you are them, meaning you are not the owner. Somebody has given you the inventory. Have you become the owner? No. Is it there in your godown? Yes. Are you the owner? Is it there in your godown? When we counted the inventory, oops, you counted it also. Does it belong to you? What to do? Deduct at cost price. Understood? Goods sent on return or approval. You understood both the cases where you are a sender, you are a receiver. They have returned, they have not returned. Can I go to the next one? Consignment. What is consignment? You are consigner. You want to sell your inventory all across India, but people don't know you all across India. What do? You send your inventory to your friend in Chennai. Ask him, hey, please sell this macha in Chennai. Whatever money you get, I give you commission macha. You keep commission, you give me money. You ask. Then your friend will say, okay, macha, you send inventory. I send to Chennai. Now tell me, is that Chennai friend of mine, Kansaini, is he the owner? No, I am the owner. This Chennai friend of mine is only agent. He will sell the inventory, collect the money, give it to me. Now, inventory is with me or my consignee. Consignee. Who's the owner? Me. When I count the inventory in my godown, I've counted what is there in my godown. There is some inventory what belongs to me, which is not there in my godown. Where is it? Chennai. With consignee. That belongs to me. Add it to my inventory. At cost price. Are you getting it? What if I send him 10,000? He's returned 4,000. 6,000 is with him. When I count, I've counted that 4 already. So I should include only. Sure. Got this? Yes, sir. Here you are consigner. Your Chennai macha is consignee. It can also happen that you are only commission agent. You are commission. You are consignee. There is someone in Andhra Pradesh who sent you goods. You are consignee. Are you the owner? Ledu, nenu kadu. I am not owner. I am only person who's keeping the goods. That goods what they have sent is there in your godown. When you count, you counted it. But is it yours? No. What's not yours is counted. So what do? Deduct chedama? Deduct it. That's it. When you deduct, it will find the rightful value of your inventory. I hope you understood goods sent on return or approval as well as consignment based adjustments in your inventory. Yes. Remember, there can be question with crossover of inventory and profit with rectification. Jai Hanuman problem. Remember? Practice that one question. Don't forget. Because whenever there is change in inventory, there can be change in profit. When the closing stock changes, profit changes. When the opening stock changes, profit changes. Whenever stock changes, profit will change. But whenever profit change, it might not be because of stock. I'll repeat. Whenever stock changes, profit will change. Whenever profit changes, it may be because of stock, but it may not be because of stock. I hope you got it. Everybody make some noise. Please ensure that you do this one question on Hanuman. You do one question on reconciliation forward, one question on backward with goods sent on return or approval and consignment based adjustment. If in case you guys want any question that you would want to specifically try, you don't know that Hanuman question or anything, please drop a message in the comments. We'll share the link of that question which is separately already uploaded in the same YouTube channel where you're watching this. And next when we start, we'll start with the topic of depreciation. Is that fine? Let's now start with the next chapter, which is about depreciation counting. Let's start with getting the word right. It is not depreciation. It's Dep. You know Johnny Depp? Like that, depreciation. So what do you mean by depreciation? The definition of the word depreciation is given by Companies Act 2013 Schedule 2. How does it define? It says depreciation is systematic allocation of depreciable amount of an asset over the useful life of the asset. Let's go slightly away from depreciation to understand depreciation slightly better. If in case I want a machine in my business, I don't have enough money to buy the machine. What do? I take it on rent. If I want an office space to function my business, but I don't have enough money to buy the office, what do? I'll take the office space on rent. I'll take the factory on rent. I'll take the machine on rent. I'll take the motor vehicle on rent. Using all of these assets, I will generate revenue. That revenue will come on the P&L statement credit side. The expense that is rental will come on the debit side. I'll match rental expense with the income that I earn. Net profit would come. Basically, matching concept what we learned yesterday. Remember matching concept? We need to match current year expenses with current year income to arrive at current year profit or current year loss. So we all know rent is an expense, P&L account debit side. Using that machine which we've taken on rent, if we earn revenue, revenue will be income, P&L account credit side. If I buy the asset, it is capital payment. It is no longer revenue payment. Remember, whenever the payment is made based on the nature of the business, purpose, recoverability, materiality, revenue generation capability, it will be categorized as capital payment and revenue payment. Revenue payment, P&L account debit side, rent paid for using the asset. But full amount paid to buy the asset will no longer be rental expense in P&L. It is capital payment. Where do you write the amount paid for purchasing the asset? Balance sheet, asset side. Asset is sitting in balance sheet asset side. From that asset, whatever income you are will come in your P&L account credit side. So there is income, there is no expense. So full income will become profit. That's where we are not following matching concept. If you buy the asset, will you write the asset in P&L account debit side or balance sheet asset side? You write it in balance sheet asset side. Using that, you earn revenue. That will come in P&L account credit side. Matching expense is only not there. Full sales amount will become profit. Is it right? No. What are we not following here? Matching concept. Now, let me give you a statement which I want you all to think and then remember for life. Whenever you take the asset on rent, it is expense. Whenever you buy the asset, it is several years rent paid together. It is several years rent paid together. I can buy a bike by paying 1 lakh rupees. I can take the bike by paying 10,000 rupees annual rent. If I pay 1 lakh rupees and buy the bike, it is just 10 years rent paid at once. It is just 10 years rent paid at once. This is the ideology that we should keep in mind to ensure that we understand depreciation from the scratch. So that entire amount that you pay will be an asset because it is deferred expenditure. Treatment is like deferred expenditure. Part by part, I go on transferring that asset to P&L account so that the asset gets closed at the end of the useful life. If I don't do this, I purchase the asset today, I write 1 lakh rupees in the balance sheet asset side. One fine day, all of a sudden it becomes zero. It doesn't become all of a sudden zero, no. It will slowly, gradually decrease and then it will become zero. 1 lakh will become 90, 90 will become 80, 80 will become 70, 60, 50, 40, 30, 10, and then zero. It's not like it was 1 lakh, it suddenly became zero. That's not how it is. So that's the reason we depreciate an asset. It is systematic allocation of the depreciable amount of the asset over its useful life. You buy an asset for 1 lakh rupees. Useful life of that asset is 10 years. 1 lakh will be returned to P&L account over 10 years. 10,000, 10,000, 10,000. Depreciation. Here we have a beautiful word which I have underlined. What is the word that you see? Depreciable amount. What do we mean by depreciable amount? You bought the asset for 1 lakh. That does not mean asset has to be depreciated by 1 lakh. Why? You paid 1 lakh to buy the asset. At the end of the useful life, if you sell to the scrap dealer, he's going to give you 90. So he's going to give you 10,000. When you bought the asset, how much money did you pay? 1 lakh. At the end of useful life, when you sell, how much do you get? 10. So your usage is only 90. 1 lakh what you gave, in that 10,000 you got back at the end of useful life. So your depreciable amount is 90,000 only. That's the reason when you compute depreciation, you use the formula original cost minus scrap value divided by useful life. Total depreciation will be depreciable amount. Total depreciation over the entire useful life will be depreciable amount. How to write it in each year? How much to write in each year? That is the method of depreciation that we decide later. Focus on the keywords that we should know. Why do we provide for depreciation? There are several reasons. Number one, wear and tear. Akaladu, ariyadu. You wear it, you tear it, asset will get depreciated. But the depreciation, you might have heard that it starts when the asset is ready, not when it is actually put to use. This is because wear and tear is one of the reasons for depreciation, not the only reason. If the asset is ready, but you don't use, still it depreciates. Why? Obsolescence or effluxion of time or change in trend, change in technology, decrease in market value, consumer preferences changing. All of these are the reasons why the asset will be depreciated. You bought one asset, you don't use, you keep it idle. In spite of that, the asset value will come down. Why? Effluxion of time. Time decreases value of items. Get it? Same with obsolescence, outdated technology. A better technology is there in the market. iPhone 17 comes, iPhone 16 value drops. iPhone 18 comes, iPhone 17 value also drops. Right now, people feel young, energetic, and like, hey, I am the most youngest person. Yeah, give 2 years time. There are people who are more younger than you. Oh, then you are old. You get outdated. Sir, you, I am not. Yeah, how old are you? Like, I am 18 years with 12, 13 years experience. Yeah, after one point, you stop aging. All thanks to people like you. I even know what is 6-7. Not many people who are 2-3 years younger to me know it. Let's proceed. You understand why depreciation? Okay, jokes apart. Yeah, I am very old. Yeah, full white hair. Today only I put dye. You see here, little bit of skin also. It's become black. Morning urgent alakbek. Then we'll discuss objectives. What are the objectives of providing depreciation? If you don't depreciate, asset will be shown at original cost in balance sheet. Nothing of it will come in P&L. Asset 1 lakh balance sheet. P&L account debit side, nothing. If you sell and get 10,000 revenue, full 10,000 profit, there is no matching concept. You are not matching. Your profit will become incorrect. If your profit will become incorrect, no, then your decision making also is incorrect. Let's say someone is dropping me home. He bought one bike for 50,000 rupees. I'll say I'll pay you petrol fee 100 rupees, you drop. Petrol I'm paying, but bike value also will depreciate. No, I need to pay for that also. So you won't just pay the revenue expenditure. You also need to pay the recovery of the overhead that is incurred on the asset. So if you don't provide depreciation, the income that you compute will be incorrect. And if you don't depreciate, 2 years ago you bought the asset. Will the asset be still at 1 lakh? No, the asset value will decrease. So the balance sheet position of the asset also will be incorrect. And with this wrong data, what happens is you don't provide for any funds for replacement of the asset. And this will eventually lead to non-availability of cost of production, which will not let you know how much profit to book, and which will not let you decide how much the sale consideration that you should charge. So the objectives of depreciation is correct financial statements, that is both income statement and position statement, identifying the cost of the production so that you can fix the selling price based on the profit required, and also arrange for funds for replacement. Every time you record an asset of 1 lakh depreciated by 10,000, you reduce it to 90,000. You will know that 10,000 rupees there is depreciation, no, profit will decrease by 10. If not, let's say 1 lakh rupees asset you use, you make 20,000 sales in the current year. You think full 20,000 is profit, full 20,000 you will give as dividend or drawings. When you write depreciation 8,000, profit will reduce to 12. So though you have 20,000 cash in your balance sheet, you cannot use full 20 because you know 8,000 is an expense, but it is non-cash expense. This will stop you from using full money. This will let you accumulate the money. When you go on accumulating the money, by the time that 1 lakh rupees asset becomes zero, you will have enough money to buy a new asset. To buy a, I hope you understood. Fantastic. Let's proceed. The next point that I wanted to know is on what is depreciation charged? Depreciation, can it be charged on sundry debtors, inventory, investments, bills receivable, cash, bank? Tell no on what? Fixed assets. I want you to tell on what will you charge. Fixed assets. Fixed assets is an old word. 90s, millennials. Come on, Amma, Gen Z. What should you tell? It's not fixed assets. It is called PPE. It's called property, plant and equipment. Previously, there used to be a standard by name Accounting Standard 10, which talk about fixed assets, and there was Accounting Standard 6, which spoke about depreciation. Both of them are replaced with one brand new Accounting Standard 10, which is already 10 years old. No, easily 5, 6 years old. This Accounting Standard 10 is now called as PPE, property, plant and equipment. I hope you got it. What do you mean by a property, plant and equipment? It is a tangible asset. It should be tangible. It should have physical existence. But if it is intangible, that is intangible asset. For PPE, it should be tangible asset. Sir, don't we depreciate intangible asset? We depreciate them. But there it's not called as depreciation. It is called as amortization. But the treatment is completely same. This unit anyways will be discussing depreciation and amortization. So it's a tangible item. It should be held with one of the four purposes. Number one, to produce goods. Number two, to give services. Number three, to use in administration or to give it in rental. Now, I bought one laptop. It is used by connecting it to the machine. I connect this laptop to the machine, and using this laptop, I run the machine. So that is used in production of goods. Used in rendering services means I'm a chartered accountant in practice. I use my laptop to send mail to client, to analyze the data, to prepare financials. It is used in giving services. The third point is rental purpose. What I do, I buy laptops, I give it on rent, and I earn rental income. That's my third purpose. Fourth one, I use a laptop in administration purpose, meaning you might have seen one laptop in the classroom teaching. This is used to give service. In the accounts department, in the reception cabin, in the technical team downstairs, when you see, they also have one laptop. They also have one PC. They use that PC to administer everything that is going good or not. So, an asset which is used in production, an asset which is used to give services, asset which is used for rental purpose, as well as the asset which is used in administration, all of it will be called as property, plant and equipment, provided it is tangible. And the next point is its useful life is greater than 12 months. It is useful for a period greater than 12 months. Come on, quickly read PPE definition. PPE is a tangible item held for use in production, use in rendering services, rental purpose and administration purpose, and expected to be used for a period greater than. Yeah, you understood the definition of property, plant and equipment, everyone? Let's proceed. Now, after we know the definition, you understood the reason why we should depreciate and everything. Now, I want you to know what are the things that will influence depreciation. Depreciation is not same on every asset. Depreciation is dependent upon certain things. Number one, it depends upon the cost of the asset because cost of the asset is only depreciated over the useful life. So cost is split and then written over the useful life as depreciation. So the first influencing factor is cost. The second influencing factor is estimated useful life of the asset. You bought one asset for 1 lakh. If you estimate the useful life for 10 years, you write 1 lakh over 10 years. If you estimate the useful life to be 3 years, you write 1 lakh over 3 years. If you estimate the useful life to be only 2 years, you write 1 lakh over 2 years. Depending upon number of years, depreciation value changes. And the third and important factor is residual value. What if I buy an asset for 10 lakh rupees and its residual value is 10 lakh rupees and my useful life is 5 years? I actually will not charge any depreciation only. Why? I bought it for 10 lakh. Residual value is 10 lakh. So I bought it for 10. After 5 years, I'll sell it at 10. There is no decrease in the value only. So there will be no depreciation. You will do this in CA Inter when you come. Lot of times you get government grant and several other things. You might buy the asset at concessional price. In such case, you will not provide any depreciation on the asset. When asset is already recorded at the residual value. That's a point at which you stop depreciation. We'll discuss at large when you come to CA Inter, Advanced Accounting, Property, Plant and Equipment. For now, all that I want you to know is these are the three important factors which will decide depreciation. What are they? Number one, cost of the asset. Number two, estimated useful life. Number three, number one, cost. Number two, estimated useful life. Number three, whether you follow straight line method or you follow written down value method, production units method, sum of weightages method, depletion method, whichever method you follow, these three are important. These three will be available. This is not only for SLM. Misconception is SLM we have to compute, sir, original cost minus scrap value divided by useful life. WDV, they'll only give percentage. No. WDV also the percentage is computed using this one. Let's quickly see. So the cost of the asset will include three important things. Number one, purchase price. When you purchase the machinery, when you purchase the asset, when you purchase the PP, whatever you pay is purchase price. I have 2-3 cute questions. Can I ask? Sir. Now, on the purchase of this asset, in the invoice, they've charged me GST. You know GST? Good and sweet tax, goods and service tax. GST, goods tax is being charged. Should I include the GST amount in the cost of the asset for depreciation? Should I exclude the GST? To tell 1 lakh is the cost of the asset, 10,000 rupees is GST charge. I paid 1 lakh 10,000 to buy the asset. Now, when I'm computing depreciation, should I compute depreciation on 1 lakh or 1 lakh 10? Depends whether input tax credit is available or not. When input tax credit is available, I will write PP account debit 1 lakh. Input CGST, SGST account debit 10,000 to bank account 1 lakh 10. What if input tax is not available? Asset account or PP account debit 1 lakh 10 to bank account 1 lakh 10. If input CGST, input SGST is available, that GST amount will not be included in the asset. If input is not available, then that input CGST, SGST is not available. No, write that also in the cost of the asset only. Full 1 lakh 10 will provide depreciation. I hope you understood. Same thing we discussed in inventory also. Okay, I've got a special request. You guys told me that you want me to discuss that GST part in detail. We'll not keep it as a part of our marathon, but we'll keep it as a separate discussion. We'll do that because I don't want to make marathon unintentionally being stressed on one specific topic and made long. So we'll discuss that GST based journal entries as a separate set video. We'll get it in the same channel. You can watch it separately, but not part of this video. Proceed. Directly attributable cost. After you buy the asset, till the time the asset is ready to be put to use, you will incur several expenditure. To buy the asset, you might have to go inspect the asset, that inspection expenditure. You might take some expert suggestion, professional advice, which asset to buy, that one. Once you buy the asset, you can't bring the asset and then install immediately. You need to disassemble the asset, pack it, load it, octroi, carriage, and then once it comes to the city where you are, unload, unpack, assemble, engineering cost, site setup cost, installation cost, trial run cost, trial run material, trial run labor, trial run overhead, all of this cost till the time the asset is ready to be put to use. Remember, ready to be put to use, not actually put to use. Till the time the asset is ready, any expense incurred will be added to the cost of the asset. Once it is ready, you should stop. Asset is ready to be used in January, but you decide to use the asset from April. February and March, time is not good. Stars are alignment is not good. So you're postponing. Those 2 months, if you pay some rent, if you pay some maintenance, if you pay electricity, can you include that in the cost of the asset? No. That should be charged to P&L. So the expenditure till the time the asset is ready to be put to use should be charged to the asset. So this part you understood. Then estimated cost of dismantling. This you don't have it in foundation. But I can just tell you one line. which is not important here, but you can just know. At the end of the useful life of the asset, you might have to remove the asset and then give it. Now, asset is installed in the ground, 3 feet deep I've dug, and then I place the asset, put cement to brick, nut to bolt to tie to everything. After 3 years, I can't do like this. I would have to uninstall, no. Uninstall also, I would have to bring laborers. They would have to take, they should do, and then open the nut and then remove the asset. Asset I can't lift and throw like this. I need 5 people to hold, lift, and keep it outside. And I keep it outside, BBB people will not take. This is not asikasana, onakasana. No, this is not kasa. They will not take. You need to disassemble this machine. Corrosive material, non-corrosive metal, electrical filling, wood, and then biodegradable, non-biodegradable, chemical waste, and then radioactive element if there is any. So you need to segregate that and discard it separately. This expenditure should be incurred when at the end of the useful life. 10 years you're going to use the asset. 11th year you'll spend the money. You need to identify how much will you spend after 10 years. Estimate it. You know time value of money? Discount that money to today's date and add it to the cost of the asset and depreciate it. If you bought the asset for 10 lakh and after 10 years of useful life, if you're expecting to incur 1 lakh, that 1 lakh's present value also should be added to 10 lakh and you should depreciate the asset. We'll do detailed problems based on this in inter. But right now, you just have to know that cost of dismantling that will be incurred at the end of the useful life of the asset should also be included in the cost of the asset. Next, we'll discuss the methods of depreciation. How many methods of depreciation do we have in inter? Sorry, foundation. Not two. You have SLM, WDV, production units, sum of year digits method, machine hour rate method, depletion method. 6 methods are there, and questions can come on any of the 6. Don't put stress, time, energy on 1, 2, and then say, "Ayyo, I expected something, it came in something else." Don't expect anything. Done. Let's begin. Before we go there, I want you to tell me, how do we decide which method of depreciation should the organization pick? Among all the depreciation methods? No. Question they give. I'm going to say generally as an entity, how do I pick which method to follow? Yeah, POU. It is dependent upon the pattern of usage. It is dependent upon the pattern of usage. How are you expecting to use the asset? That will decide the method of depreciation. Let me explain it. Let's start with the first one, straight line method. You expect to use the asset in the same pattern every year. The useful life of the asset is there, let's say about 4-5 years. And during this, the expected usage pattern is straight line. Expected usage pattern is first year production, second year production, third year production, fourth year production, level of usage, pattern of usage, economic useful, everything is in a straight line. Depreciation also will be same every line. So this is the graph. If you draw keeping year 1, 2, 3, 4, 5 on the x-axis, depreciation amount on the y-axis, if you keep, this is how the graph will be for depreciation. This is called as which method? Straight line method, or also called as fixed installment method, or also called as original cost method. How do we compute depreciation under this method? Under this method, depreciation for year 1, year 2, year 3 is same. Every year, it will be constant. The depreciation percentage is applied on the original cost. And depreciation percentage is computed as depreciation amount divided by original cost. How do we find depreciation? Very simple. It is original cost of the asset minus estimated scrap value divided by useful life. In this, two things are estimate. Number one, how do you tell the asset will realize 10,000 at the end of useful life? Estimate. How do you tell asset will last for 10 years? Estimate. Based on two estimates, when you compute depreciation, depreciation is an accounting estimate. Based on two estimates, if you find the third thing, it is also an accounting estimate. So depreciation is not an accounting policy. Depreciation is an accounting. This is not the first time we're discussing this. Yesterday also we discussed the same thing. I hope you remember. Let's proceed. So after this, we have the next method called as diminishing balance method. In this, no, the usefulness of the asset, the economic viability of the asset will go on decreasing from 1 year to another year. First year efficiency is high. Second year slightly less. Third year even less. Fourth year even less. So if you draw a graph for this, no, it will be like a slide. First year high usage, second year slightly less, third year lesser than second year, fourth year even lesser than first year. So because the utility of the asset is decreasing year on year, depreciation expense should also decrease from year to year. First year depreciation will be greater than second year depreciation. Second year depreciation will be greater than third year. Third year will be greater than fourth year. I hope you're getting the logic of depreciation under WDV method or diminishing balance method. How do we find depreciation under this method? How do we find? Very good. You'll take the not original cost, but you'll take returned on value and multiply with percentage. How do you find percentage? It will be given in the questions. How do we find it in your SLM method? Depreciation divided by amount multiplied cost multiplied by 100. How do you find depreciation percentage in WDV? There you find depreciation amount, and using that you find the depreciation percentage. Here formula is 1 minus nth root of residual value divided by cost of the asset. 1 minus nth root of residual value divided by cost of the asset. Residual value is the value of the asset at the end of its useful life. Cost means original cost. What is N? N is number of years of useful life. What is N? Number of years of how many years are you expecting the asset to be used? But you don't have to remember this. They'll usually given this in the question. But do you know how to find fourth root, fifth root, sixth root? You would have learned it in your QA class. Yeah, definitely not needed. They'll usually give percentage of depreciation in the question only. But one attempt, if they want to play with your mind and then give one small question on this, please remember the formula. Okay. Very good. Then N is useful life in years. Let's go to production units method. It is too mainstream to tell useful life is 4 years, useful life is 5 years. I bought one machine. And how many years can I use the machine? My production manager told, sir, you can use this machine for 5 years. I told, okay, 5 years. I started depreciating for 5 years. After 3 years, machinery stopped working. I asked my production manager, you told the machinery can be used for 5 years. Why did the machine stop by 3 years? He told me, sir, whatever the production that could have been done over 5 years, you made me do it in 3 years. The useful life of the asset was 50,000 units. How many units? Over the entire useful life, using the machine, you can manufacture 50,000. Based on the time limit that they work 8 hours in a day, 10 hours in a day, in a year, only 10,000 units was possible. So if you manufacture 10,000 units in year 1, 10,000 units in year 2, like that 10,000 units every year, useful life will be 5 years. That's what my production manager told. What did I do? I am greedy. I wanted to manufacture more units. You know what did I do? I put people in 2 shifts and I made the machine produce 15,000 units every year. In 3 years only 45,000 units are produced. In 4th year, first 2-3 months only, asset stopped working. So, can I say measuring the useful life of an asset based on number of years is vague? It is incorrect. Do you agree with me? It is actually dependent upon number of units that it can produce. How long will a washing machine last? You say, sir, 10 years. No, washing machine will not last for 10 years. Washing machine will last for 2,000 washes, 3,000 washes. 3,000 times you can use the washing machine. Once 3,000 times you have used, it will stop. If you keep washing machine at home, you might use it once every 2 days. Or some houses where a lot of people are there, once every day. Once every day if you use, how many times will you use in a year? 365. So it will last for 3,000 washes, means it will come for 10 years. What if we keep the same washing machine in a PG where there are 10 rooms and each room has 2 to 3 people, and washing machine is free to use for everyone there? Will it last for 10 years? No, 4 years or 5 years. Why? In a single day, washing machine is put 3-4 times. If it is put 3-4 times in a single day, what will happen? In 365 days, in 1 year, you already used it 1,000 times. So it will last only 3 years. It is working according to its efficiency only. You used it more. In fact, you didn't use it, you abused it. Are you getting the difference here? So, it is incorrect to measure the useful life of an asset based on time, based on years. The more precise way of measuring it is production units. You decide how many units can be produced from this asset. During the year, how many units did you produce? Proportionately, you charge depreciation. You will identify how many units can be produced over its useful life. Identify per unit depreciation. Multiply with number of units that is produced during the year, and that will give us the production units method. This is in fact one of the most logical methods of depreciation. During 1 year, you produced only 100 units. During 1 year, you produced 2,000 units. Another year, again, you produced 100 units. You cannot follow SLM, you cannot follow WDV, because WDV is like this. SLM is like this. Your pattern is 1 year less, 1 year more, 1 year less, 1 year more, 1 year less, 1 year more. For you, production units method is more suitable. I hope you get it. Let's see. Under production units method, the useful life of the asset will be depending upon the usage. So higher the production, higher the depreciation. Lower the production, lower the depreciation. However, the production chart moves, depreciation chart also. I hope you got it. The next point that I want you to know is, under this method, useful life is measured in terms of production units. How do we measure the useful life? In terms of production units. Depreciation is dependent on units produced during the year. What is depreciation dependent upon? Units produced during the year. Under this method, we compute depreciation as original cost of the asset minus scrap value. That is a depreciable amount. Divide it by total useful life in terms of units. Multiply it with number of units produced during the year. That's it. Simple. See, how do you identify? Cost minus residual value multiplied by number of units produced during the current year divided by total useful life of the asset in units. And this is how we compute depreciation under production units method. I hope everybody got this. Let's go to the next one. So we're done with the production units method. Then we have something called machine hour rate method. Some assets are not used in production of inventory. I told you PPE definition. Remember the PPE definition? Property, plant and equipment is a tangible asset which is used in production of goods. But not everything is used in production of goods. Some things are used in rendering services, administration or rental also. For example, let's take laptop. How many years do you think the laptop will survive? You told 5 years. How many? Yeah, you tell me. Basically, when we tell 5, no, it depends upon how long will I use. If I use 3 hours or 4 hours in a day, might be 5 years. If I use 20 hours in a day, might not be 5. It might end up after 2 years. So you're getting it? It depends upon how many hours do I use. So this will have some number of hours written as its fate. 20,000 hours. 1 lakh hours. It's written in the fate. 1 lakh hours, if it gets exhausted early, it will die early. If you use only 1 hour every day, it will last for 15 years also. Are you getting it? It depends upon the time. But time, you cannot measure it in terms of years. Years is too much or too vague to measure. You should bring it down. Time should not be measured in years. Bring it down to months. Months should be broken down to days. Days should be broken down to hours. How many hours are you using the machine is very important. When you use the machine for 6 months, you do depreciation into 6 by 12, no? It is not important for how many months is it used. It's important to know how many hours in that 6 months is it used. What if some 6 months you used 186 hours? Sometimes in one entire year, you use it only for 95 hours. Depreciation is not correct. You can't compute like that. It depends upon the usage. Usage, time is a good factor, but not in terms of years, but in terms of hours. So we measure the useful life of the asset in terms of hours. When the manufactured tire, they say this tire is good for 1,20,000 kilometers. Many of you, when you buy bike or car, how often do you change your tire? Help me, no? Car, how often do you change? 2 to 3,000 hours. Kilometers. How many? Every 10,000 kilometers you change the tire. It doesn't matter how much time. Some of you cab driver, every day you run 1,000 kilometers. At least very early you will make 10,000. Some of you will run only 15 kilometers, 10 kilometers every day. You might take quite long. But you change the tire after every 10,000 kilometers. That 10,000 is the useful life of the tire. Doesn't matter how long you use it. How many hours do you use in a day or how many kilometers do you run in a day? Similarly, every asset's useful life is measured in terms of hours. It will be measured in terms of hours. So total original cost of the asset, you will deduct the scrap value or residual value. Divide it by total useful life in hours. That way we get how much is the decrease in the value of the asset for every hour of usage. Multiply that with number of hours that they've used and you'll end up finding the depreciation under machine hour rate method. This is actually SLM. This is actually in SLM you do number of years. Here you do number of hours. That's the only point of difference. This cousin brother of SLM where hours is more important than years. Next, the last method that we have is depletion method. Depletion method is applied exactly like machine hour rate method, exactly like production units method, but this is for wasting assets or natural resources where you don't actually buy it, you take it on lease. Can you buy land? Yes. Can you buy a quarry? No. Quarry is a natural resource. Can you buy a mine? No. It's a natural resource. It belongs to the government. It belongs to the people of India. Government can only give it to you on lease. Government can only give it to you on because nobody is interested in buying. Once you buy that land, once you extract all the mine that's there in that land is useless. So people usually take it on lease. People usually take it on. Very good. So when you take it on lease, depending upon how much you can extract during that period, you will identify depreciation. Let's say you took on 5 years lease. You will identify how many tons of minerals can you extract over 5 years. Let's say you can extract 1 lakh tons of minerals over 5 years. And during first year, you extracted 20,000 tons. How much did you extract in first year? 20,000. How much is the total extraction? 1 lakh. 20,000 by 1 lakh. Multiplied by whatever is the lease amount. Let's say lease amount is 50 lakh. 50 lakh is the lease amount. Multiply that with how much is the production during the year divided by total expected extraction over the entire lease period. That entire lease period, how much can you extract? It is taken based on the actuarial valuation. It is taken based on the actuarial is a specialist. They will tell us, now I will show you one mountain and then tell in this granite is there. Tell me how many tons of granite is there. Simple, sir. Lift the mountain, keep it on the weighing scale. Other side you put takli pottu, you will be able to tell. Hey, how can you lift ya? Oh, what big scale do you get? So you can't. They will use differentiation, integration, and everything. Calculus. They will see the light is falling in this angle, the shadow is this much. So this using this multiplied by this d by dx. If I put the surface area is this much. And in this surface area, how much of stones can be there? What is the density of it? They'll put all that calculations and they'll tell this many tons of granite is there, this many tons of gold is there, this much of silver is there, whatever resource, metal resource, oil resource also, everything they estimate. Once they tell that, I am taking on lease for only 5 years. In 5 years, how much can I extract? I can extract 2 lakh tons. You can extract 20,000 tons. You can extract 67,000 tons. They will come at some estimate. That is based on their calculations. They learn how to do that for 5-6 years. Don't expect to learn it 2-3 days. That will be given to us in the question and we'll consider it. If you're really curious, post qualification as a chartered accountant, you can pursue the field of actuarial valuation. Very beautiful field, very highly paid, very less people pursue, very challenging also. You need to be really, really good at math and stat. Sir, if that was there, then why would I have been doing CA? No, if any one of you are really, really curious, someday after your CA foundation examination, do a little bit of research. Actuarial science is an amazing field to pursue your career. You can do BSc in actuarial science, but to do that, you should have taken science in PU, or if you've taken commerce, you should have taken mathematics and statistics separately later. Yeah. Now let's get back here. You understood? Yes, sir. Last one is sum of year digits method. How do we find it under sum of year digits method? Very simple. We estimate the useful life as to how many years are there. 5 years is the useful life, or 6 years is the useful life. Once we find that estimate, we identify sum of year digits. Meaning, if it is 6, it is 6, 5, 4, 3, 2, 1. We take sum of all that. We take sum of all that. What is sum up to 6? 1 plus 2 plus 3 plus 4 plus 5 plus 6. Do it quick. 1 plus 2, 3. 3 plus 3, 6. 6 plus 4, 10. 10 plus 5, 15. 15 plus 6, 21. Sum up to 6 is 21. Is there a shorter way to find it? Yes, of course. How do we find it? N plus 1 into n divided by. This is the simplest way to find the sum up to certain digits. How do we do this? What is the derivation of this formula? Very simple. Yeah. I want to find sum up to 100 digits. Basically, I need it for this depreciation. How do we compute depreciation? Cost minus residual value. Once again, yeah, cost minus residual value, depreciable amount, multiplied by remaining useful life at the beginning, divided by sum of year digits. This is a formula. But let's come to see what is that sum of year digits. Let's say up to 6 digits. So you did 1 plus 2 plus 3 plus 4 plus 5 plus 6 on calculator. Some of you did like this and then you told. Let's say you want to find sum up to 100 digits. How do you do it? Calculator the 1 plus 2 plus 3 plus 4. You'll take how much time? 3 minutes. Isn't it too much time? So let me write it. I'll write 1 plus 2 plus 3 plus 4 plus 5 plus 6 plus 98 plus 99 plus 100 is equal to n. Same equation. I'll switch. 1 plus 2 is how much? 2 plus 1 is how much? So if I do 1 plus 2 plus 3, it's how much? What is 3 plus 2 plus 1? Same, no? So I'll write the same thing ulta. I'll write 100 plus 99 plus 98 plus 97 plus 96 plus 3 plus 2 plus 1. That will also be n only, no? I have two equations. I have one variable. I can find it easily. To find one variable, you need two equations, no? I'll add 1 plus 100, 101. 2 plus 99, 3 plus 98, 4 plus 97. Like that, 5 plus 96, 6 plus 97. Same thing. At the end, 99 plus 2, 101. 100 plus 1. So can I say every time it is 101, 101, 101 is equal to 2n? If I bring that n below, it will become 101 is equal to 101 into 100 times. No, I've written plus 100 times. So it is repetitive addition is multiplication. What is multiplication? Repetitive. It is 101 into 100. Meaning 100 times 101 is equal to 2n. I'll bring the 2 to the denominator. It will become 101 divided by 100 is equal to n. I'm finding sum for 100 digits. No, that is nothing but it's not 101. It is 100 plus 1 into 100 divided by 2. If I'm finding sum for 100 digits, I would have to do 100 plus 1 into 100 divided by 2. If I'm finding sum for n digits, I should do n plus 1 into n divided by 2. This is the reason why we take that n plus 1 into n divided by 2, the formula. I hope you understood. This is denominator. Let's say the useful life of the asset is 5 years. Useful life of the asset is 5 into 5 plus 1. 6 ಆಗುತ್ತೆ. 5 6 are 30 divided by 2 15. 15 will become denominator. In the first year when I'm computing depreciation, I'll do remaining useful life at the beginning of year 1 is 5. I'll do 5 by 15. For second year I'll do 4 by 15. For third year 3, then 2, then 1. So this is how I compute depreciation. Are you getting this? So the depreciation is found as cost minus residual value multiplied by remaining useful life at the beginning of the year divided by sum of your digits. Sum of your digits method, your favorite in September 2025 exam. In fact, in that question, it's where they ask with provision and sum of your digits method. You would have practiced SLM, you would have practiced WDV. They asked sum of your digits. To be honest, sum of your digits is much easier to do in that question than SLM or WDV. Yeah, later in this specific video only you guys watch, I would have added solution to September 2025 question paper. You will find it, you will understand it. Yeah, let's proceed. After this methods of depreciation, next thing that I want you to know is computation is very simple. From the time the asset is ready to be put to use, you will compute depreciation till the date the asset is used. What if you sell the asset after 6 months? Compute depreciation for 6 months. What if you sell the asset after 9 months? Compute depreciation for 9 months. What if you buy the asset after 3 months in the year? Then again you will compute the depreciation from the 4th month to 12 months. That is only for 9 months. What if you buy the asset not on 1st April but 1st of July? You will compute depreciation from 1st of July to 31st March. What if you sell the asset on 31st of October? You will compute depreciation from 1st of April to 31st October only. I hope you got it. In between, after writing the depreciation, you understood that the useful life, whatever you wrote, you somehow feel it's not correct. The scrap value, whatever you used, you somehow find it incorrect. You estimated the useful life to be 10 years. You went on depreciating. 4 years over. After 4 years, what is the remaining useful life? 6. Initial estimate of useful life is 10. You kept 10 in mind and you went on depreciating. How many years is over? 4. After 4, what is the remaining useful life? When you have 6 years as remaining useful life, when you have 6 years as remaining useful life, you thought 6 is correct now. You realize no, asset will not last for 6 more years, it will last for 4 more years only. Initially 10 is estimate. Now after 4, it should be 6, you are re-estimating it to be 4. 4 is over, 4 is remaining. Entire useful life of the asset is now how much? Now this is change in accounting estimate. What is this? Change in accounting? We should not change the depreciation from year 1. Year 1, year 2, year 3, year 4, whatever is over. Katam. Don't worry about it. Forget it. From now, start recomputing the depreciation. Are you getting it? So the method of depreciation can change. That is an accounting estimate because of the change in the expected pattern of usage. Similarly, there can be change in the useful life of the asset. There can be change in the scrap value of the asset also. There can be change in the expected useful life as well as expected residual value. Asset was 10 lakh. Expected scrap value 1 lakh. Useful life 3 years. Assets cost 10 lakh. Sorry, 1 lakh. 1 lakh. Scrap value 10,000. Useful life 3 years. 1 lakh minus 10 divided by 3. 30,000 no every year depreciation. Later you realize, it's not 10, it is 20. It is change in accounting estimate. Whichever year you realize that it has changed, from that year you recompute the depreciation. Same with useful life also. I thought whenever useful life changes or expected residual value changes, depreciation amount changes. Whenever the pattern in which you are expecting to use the asset changes, again method of depreciation changes. In all the 3 cases, it is change in accounting estimate. It is not change in accounting policy. It is change in accounting. It's not change in accounting because it is change in accounting estimate. We should always give it what effect? prospective effect. What effect should we give? Prospective means whatever is over is over. Till now, how you wasted time, what and all did you do, what chapters did you skip, how creatively were you studying, how much of laziness you put, nobody cares. From now, you correct your mistakes and ensure that you do well in the upcoming exam. Done. Let's see one beautiful example here. Observe this. An organization has machinery bought for rupees 1 lakh. They used useful life of 5 years, zero scrap value. 1 lakh divided by 5. Sorry, 1 lakh minus 0 divided by 5. 20,000 is the depreciation, no? They followed SLM for first 2 years. First year, they did 1 lakh minus 20, 80. 80 minus 20, 60. They did beginning of third year, they changed the method to WDV 25%. Actually, 20% ಮಾಡಿದ್ದೀನಿ ಇಲ್ಲಿ. Adjust ಮಾಡ್ಕೊಳ್ಳಿ, please. So that 60,000, from now I'll apply WDV. I can't change from year 1. Will I change from year 1? What is over is, from now I will change. I hope you got it. Everybody? Cool. Come on. Let's go to the next example. An organization purchased a machinery for 1 lakh with useful life of 5 years. Scrap value 0. Think and tell me how much is depreciation? How did you get 1 lakh? Minus 0 divided by 5. You got it? 20. So I depreciated the asset. 1 lakh opening book value. Depreciation 20. Closing book value 80. Next year opening book value 80. Depreciation 20. Their closing book value 60. 60, 20, 40. 40, 20, 20. 20, 20, 0. This is very fast. Now, let's change some numbers. At the end of year 2, at the end of the remaining useful life was estimated to be 2 years. After year 2, 60,000 is the value. Remaining useful life is 3, no? It is re-estimated to be only 2. Don't change year 1, year 2. 60,000 you divide by 2. 30,000 will be depreciation for year 3. 30,000 will be depreciation for year 4. Your initial estimate is there, no? Based on that, after year 2, remaining useful life is 3. On the re-estimated basis, after year 3, useful life is 2. So 2, okay. 1 year it's missing out, no? 5th year asset is not useful. 5th year I can't charge 20. So what will I do? This 5th year's 20,000 will be shared to year 4 and year 3. Divide it by 2. Add 10 to this, add 10 to this. That's how year 3 and year 4 depreciation will become 30 and 30. I hope you got it. Yes, let me show how it works. 5th year depreciation of 20,000 will be taken back. Basically, 5th year opening book value should become 0. So 4th year closing book value should become 0. So what do I do? 5th year there can't be depreciation. This depreciation will be added to year 3 and year 4. So 20 will become 30. And here also 20 will become 30. And 30, 30, 0. Or in another way, after year 2 when you re-estimate the useful life, 60,000 you divide it by not 3. If you divide 60,000 by 3, 20,000 for next 3 years. If you divide 60,000 by 2, 30,000 for year 3, 30,000 for year 4 will become your depreciation. I hope you got it. Yes, this is how you account for change in the method of depreciation. I also taught you how to account for change in expected useful life. Change in residual value, I don't see you having any questions. But if it comes also, treat it the same way. I hope everybody got it. Can I now proceed to revaluation? Revaluation is an option. It's not compulsory. Once every 3 years or once every 5 years, depending upon the volatility of the business, company should check the value of the asset in their balance sheet. After you taking original cost, whatever method depreciation you're charging, you would have written WDV, no? Just see the WDV, see the asset, see the WDV, see the asset, see the WDV, see the asset. Is it matching? If it's matching, very good. Very good. Continue the same method of depreciation. If you will like, chichi, this asset, this value, not right. Something is not matching. Value is more, asset is of cheap value. Or asset is of more value, value is less. One of it, if it is possible. If it is possible, then we'll say this asset has a value already. This asset has already has a value, but I don't like that value. I don't think it is correct value. It is misleading. It is misappropriated. It is incorrectly shown in the balance sheet, because of which my financial statements will give wrong understanding. So what do? I will tell, okay, innocity value madana. We'll do it. That is called revaluation. Does it already have a value? Yes. Yes. Original cost minus scrap value. Oh, sorry. Original cost minus depreciation till here. If you do have some value, no. Carrying amount. That's a value. But we think that value is not correct. There is already one value, but that value is not correct. Let's say I conducted one accounts mock test. You wrote the test. Out of 50, you got 48. You think 48 is not the right value of your answers. You bring and say, sir, this question, sir, my friend has written, you given her 2 marks, to me you given 1 mark. Both of us copied from the same sheet. How did you do this, sir? You give. Then I'll check the answer. Hey, correct answer. Then I've given you 1 mark, I'll cut that 1 mark, I'll make it 0. So I'll give 2 marks. When I make that 1 mark as 2 marks, already assigned value 48. But that value is not correct. For your answer paper, I'm giving 49 or I'm making it 47. So that is revaluation. There is one value. We think that value is not correct. So we assign it new value. When you assign the new value, that new value can be more than the old value. If it is more than the old value, then it is upward revaluation. We're increasing the value of the asset. If it is decreasing, we call it downward revaluation. Do you understand upward? Cost of the asset is 10, carrying amount. I revalue it to 12. Upward, downward? Very good. The carrying amount of the asset is 10. I don't like it. I think it should be 9,500. I change it to 9,500. Downward. You understand upward, downward? When you increase the value of the asset, asset has to be debited. Asset has to be debited. When you debit the asset, credit will become income, no? Yeah, profit. No. You should not book that profit to P&L. Why? Conservative approach. You should account for expected expenses and losses, but not for expected incomes and gains. When the value of the asset is 10 and you feel it can be sold for 12, book that 2,000 profit when you actually sell. Did you sell now? No. It is there at 10. Yes. But you know its value is 12. Did you sell? If you sell, you book 2,000 profit. If you don't sell, don't book 2,000 profit. It is future profit. Write it to revaluation reserve. Revaluation reserve will not appear in your P&L account. It will appear in balance sheet, reserves and surplus. To give you a context to company accounts chapter, revaluation reserve is a capital reserve. Revaluation reserve is a, we'll discuss later in the same discussion as to bonus issue. How do we do? When you're doing bonus issue, you cannot use revaluation reserve for bonus issue. You cannot use revaluation reserve for, why? Very simple. Yeah, my company is terrible. I don't have any money to give dividend. If I should have profit, I'll give dividend. I don't have profit. If I don't give dividend, my shareholders will be upset. If they're upset, they'll sell the share. If they sell the share, demand will fall. If the demand will fall, price will fall. I don't want it to happen. I want to keep my shareholders happy. You know what will I do? I will see my PPE. Let's say from today your value is not 1 lakh. Your value is 1 lakh 20. I increase it to 1 lakh 20. PP, I get revaluation reserve 20. I'll use revaluation reserve 20 and then give free bonus shares to existing people. By this, they are happy, but it is cheating. Are you getting it? So, revaluation reserve cannot be used for bonus issue because there is no cash in it. There is no cash in it. You have not earned it. It is just that you change value of 2 items and you got some reserve, and using that you're giving party also. It's incorrect. That is the reason in section 63 of Companies Act 2013 clearly mentions that bonus issue cannot be made out of revaluation reserves. That is, they don't say like that. They say capital reserves to be used in distribution of bonus should be realized in cash. Revaluation reserve is not realized in cash. How do you say that? See the journal entry. PPE or asset account debit to revaluation reserve. Is there cash involved in this? No. That's it. You understood this? Then, what if the asset is revalued downward? That we'll see later. This treatment of revaluation reserve, there are two treatments. One, it can be transferred to P&L account, but not immediately, but over the useful life of the asset. I'll just give you a context. Value of the asset is 1 lakh. Value of the asset is, useful life is 5 years. Scrap value is 0. Value of the asset is useful life, scrap value, depreciate, 1 lakh minus 0 divided by 5. Every year you will depreciate by 20. First year 20 will go to PL, second year 20, third year 20, fourth year 20, fifth year 20. Now, I will revalue the asset from 1 lakh to 1 lakh 20. I will revalue the asset better 1 lakh to 1 lakh 10. I will revalue it upward by how much? 10. Now, depreciation will be 1 lakh 10 minus 0 divided by 5. Depreciation became 22. Every year 22,000 depreciation. Can I say depreciation is increasing by 2,000 every year in P&L? Oops. How did the expense increase? Because of revaluation. Now you know what I'll do. 20,000, sorry, that 10,000 is there, no revaluation reserve. I'll divide it by 5. Every year P&L account credit side, right? 2, 2, 2, 2, 2. So depreciation should have been 20. Depreciation became 22. P&L reserve in credit side 2. Depreciation 22, expense 2,000 income. Third year depreciation 22, 2,000 income. So net impact is only 20. If I would have not done revaluation, depreciation is 20. that excess depreciation arising because of upward revaluation of the asset will be adjusted against revaluation reserve. Excess depreciation because of upward revaluation of the asset will be adjusted against revaluation so that the net impact is same. Meaning, I think this asset should not be recorded at 1 lakh. It should be recorded at 1 lakh 20. I'll change the value in the balance sheet. P&L ali no impact. P&L ali, that is the beauty of upward revaluation using revaluation reserve. What if I do downward revaluation of the asset? Full game change. Downward revaluation, asset account credit, debit immediately P&L account. Debit immediately. Sir, but it is not today's loss. Asset you are reducing from 1 lakh to 90. Loss of 10,000 will happen when you sell the asset, not today. I agree, 100% right. If I reduce the value of the asset from 1 lakh to 90, am I selling it today? No. When will I make loss? When I sell. But conservatism, same thing which is stopping us book profit in the previous case, is making us book the loss immediately. It will say you expect 10,000 loss in the future, but record it today. Record it today. So immediate recognition of the entire loss by conservative. I hope everybody got this. This with regard to upward and downward revaluation of PPE. They'll usually give it with change in useful life and all of other things. You can still handle. Important adjustment because needed for CA Inter also. Let's see one cute question. See this. An organization has machinery bought for rupees 1 lakh. What is the cost of the asset? Useful life 5 years. Scrap value 0. Don't read the question further. Help me compute depreciation. 1 lakh minus 0. 1 lakh divided by 5. Every year you should depreciate 20. First year 1 lakh minus 20, 80. Second year 80 minus 20, 60. Third year 60 minus 20, 40. I'm about to do. Now read the second line. At the end of year 2, it was revalued upward by 15. Second year when I do 80 minus 20, 60 is there, no. Third year I'm about to do 60 minus 20, 40. But then they told, no, from now the value of the asset is not 60, you add 15,000. They asked me to add by how much? 15. So I'll do 60 plus 15. 75 is the value to be depreciated over remaining 3 years. Do 75 by 3, 25 will become the depreciation. I hope you understood. This is how we deal with upward revaluation of asset. I hope you all understood. So far we've learned with reason for depreciation, methods of depreciation, purpose of depreciation, methods of depreciation, and how to compute depreciation under each of the methods, along with upward revaluation, downward revaluation, change in the method of depreciation, change in useful life, and everything. Done. The last part that you would have upward and downward revaluation with depreciation also. The last part that I want you to know whenever we do computation of depreciation is that, last part that I want you to know whenever you're trying to account for this topic is there is one last unit called as amortization, which is also included. Amortization is also same like depreciation. What is the difference? Depreciation is on tangible assets. Amortization is on intangible assets. Assets which don't have tangible existence. Assets which don't have tangible existence are called as intangible assets. Those intangible assets will be amortized over the useful life. Over the useful life. Now, for usually tangible assets, there will be residual value. When you look at this laptop, how much can I sell it after 5 years? You will tell some value, 1,000, 2,000, 3,000. You can tell some value. For intangible assets, usually there will be no scrap value. Usually there will be no, unless it is proven and unless it is given in the question. Understood? Next one. What is the pattern? Same. Pattern of usage of the asset is the method of amortization. If you expect to use the asset over 5 years and it's generating equal benefits, divide it over 5 years equally. If there is higher benefit in one, lower benefit in the other, you can use the pattern of utility also. I hope you got it. That's how we amortize an intangible asset. There's one question about Amazon Prime in the study material. Maybe you can try that question. Swiggy? No. Streaming right for Amazon Prime. For Suryavansham movie, I don't know what. Maybe you can try that. And that's the end of this unit of depreciation and amortization. Depreciation, what we usually do by passing the journal entry, depreciation account debit to asset account has a big flaw in it. I'll tell you how. When you write the journal entry depreciation account debit, you are you are booking the expense. All good. When you credit the asset, the value of the asset is decreasing. But don't you think depreciation is an illusionary expenditure, or
non-cash expenditure which is not actual and which is not, what do you say, real. For example, my asset is here and its value is 1 lakh. It will remain 1 lakh. When I depreciate by 10, will a part of the asset get out of the asset and then go outside? Literally, asset is not going out. Then why should you credit? It is only estimate. So the logic is assets have to be recorded in the balance sheet at original cost. When an asset of 1 lakh is depreciated by 10,000, journal entry is depreciation account 10,000 debit, not credit asset. It should be credited to provision. The journal entry will be not depreciation to asset. You should write depreciation to provision. When I write depreciation to asset, in my balance sheet, from the asset 1 lakh, I deduct 10,000 depreciation and write 90. When I create provision, balance sheet asset side, I write the asset 1 lakh. Balance sheet liability side, I need to write provision 10,000. But because this provision is against this asset, I'll bring the depreciation provision from liability side to asset side, deduct from 1 lakh asset and write it 9. You will say, sir, isn't this same? No. In second year, if you depreciate the asset by 10,000, under without provision method, asset opening balance will be 90. Depreciation will be 10. Closing will be 80. However, when you do with provision, asset opening balance will be 1 lakh. Depreciation will be 10,000 first year, 10,000 second year, together 20. Outer column will be 8. So even till the last year, asset will be 1 lakh. In fact, in the last year also, under with provision method, asset will be 1 lakh. Provision for depreciation will become 1 lakh. So the asset will become 0. Are you getting it? So throughout asset account will have debit balance. I will never decrease my asset unless I sell. What is the ideology? Whenever you do with provision, we will credit the asset only when we sell. We will credit the asset only when we sell, not when we depreciate, because depreciation is only estimate. Are you getting it? Provision for depreciation is a liability. It is not charge against asset. Only as a matter of presentation, I deduct. Example, see, original cost of the asset 1 lakh, depreciation 10% SLF. Journal entry first year, depreciation to asset, P&L to depreciation. Your favorite entry. In the asset ledger, you write opening balance 1 lakh, depreciate by 10,000, closing balance 9. In the balance sheet, it would look like this. Asset will be 90 directly. What was the original cost? 1 lakh. How much is depreciation? 10. You will write 90. And in P&L, 10,000 will be there. This is with depreciation, without provision for depreciation. If you do with provision, entry will be not depreciation to asset. Instead of asset, you will write provision. And it will be transferred to P&L as usual. In the asset account, opening balance 1 lakh, you will not do any depreciation. Asset opening balance 1 lakh, asset closing balance 1 lakh. This 10,000 depreciation, what would have been otherwise deducted from asset, will be written in one separate ledger called provision for depreciation. When you do without provision, asset closing balance will be 90. Now, asset closing balance will be debit of 1 lakh. We have created one separate provision which will have credit balance of 10,000. In the balance sheet, you need to show asset at 1 lakh and you need to show provision at 10,000. Only and only as a matter of presentation, you will shift this provision from liability side to asset side and show the asset net at 90. Even in the second year, asset will be shown at original cost of 1 lakh and depreciation will be deducted to the extent of 20 to show WDV at 80. You getting it? Whenever you sell the asset, journal entry will be usually bank account debit to machinery, bank account debit to asset. If there is profit, you credit P&L. If there is loss, you debit P&L. Am I right? What is the entry when you sell the asset? Asset account debit to, sorry, bank account debit to asset. Profit, credit to P&L. Loss, debit to P&L. At what value do you credit the asset? WDV. At what value do you credit the asset? For example, original cost of the asset 1 lakh. Original cost of the asset, depreciation accumulated 40. WDV 60. Basically, we ignore 1 lakh and 40. We are usually of the opinion that 60,000 worth of asset is sold for 75,000. If you sell 60,000 worth of asset for 75,000, you are telling 15,000 profit. Your journal entry is bank account debit 75 to machinery 60 to P&L 15. This is without provision. If I maintain with provision, this depreciation of 40 would have been not charged against asset. Asset would be still there at 1 lakh. So same entry, instead of crediting machinery by 60, I'll credit machinery by 1 lakh. Instead of writing 1 lakh minus 40, I've written 1 lakh. 40,000 would be in a separate account called provision for depreciation, which are debit. So 40,000 debit to provision, 1 lakh credit to machinery, 1 lakh minus 40 is 60. So you see the difference? Bank 75, bank 75. P&L 15, P&L 15. Instead of writing machinery credit 60, I credit machinery by 1 lakh and debit provision by 40. This is with provision entry. Are you getting it? Now, this is what I want you to note. Why are we doing this provision? Once again, quickly tell me. Why are we doing with provision? Asset account should be credited only if we sell. Asset account should be credited only if we don't sell, if we depreciate, we should not credit the asset. Should not credit the depreciation is just an estimate. It is not actual. If I buy the asset for 1 lakh 4 years ago, after 4 years also original cost of the machinery is 1 lakh, it should be shown in the balance sheet at 1 lakh. It's okay if you computed depreciation of 60, right? Original cost 1 lakh less accumulated depreciation 60, outer column 40. Next year, if depreciation becomes 70, original cost 1 lakh, accumulated depreciation 70, outer column 30. Last year 60 accumulated depreciation, this year 70, difference 10,000 is current year depreciation expense, but that's not decrease in the value of the asset correctly. It is only estimated decrease in the value of the asset, which is booked by way of provision. I hope you understand. Based on this, questions has come twice in the exams, including the most recent September 25 exam. In this video only, we have September 25 paper solution. You can see that. And in the playlist, we have just done one more question, which was on provision for depreciation based method. And the second part that I see people finding difficult or suffering is the concept of disposal. Disposal will make your life much simpler. Disposal account is a temporary account open. Now you saw the journal entry for sale of the asset. What is the entry? Cash account debit, provision for depreciation account debit, to asset, to P&L. Am I right? So in asset account, you will write by cash, by provision for depreciation, by P&L. Three items are credited. Am I right? When you sell the asset, what do you write in asset ledger? See, let's see one example. In the previous case only when we did know. In this case, let's say when I sold it at loss, what is the entry? Bank account debit, P&L account debit, provision for depreciation account debit to machinery. If I prepare machinery ledger, what do I write in machinery ledger? By bank, by P&L, by provision for depreciation. Three items are written on the credit side of machinery account. Did you sell the asset three times or one time? When you sold it one time, why are you writing three times credit? That's where disposal account comes. Disposal is breaking this journal entry into three parts. You wrote bank account debit, P&L account debit, provision account debit to machinery. I'll split it into four entries. I will write bank account debit to disposal, P&L account debit to disposal, provision for depreciation account debit to disposal, disposal account debit to machinery. Original cost of the asset sold will be taken from the machinery account put to disposal. Accumulated depreciation on the asset sold will be taken from accumulated depreciation put to disposal. Cash received will be put to disposal. In disposal box, we'll find profit or loss that will be transferred to P&L. We are splitting this one journal entry into four. This is without disposal account. Tell me what will be the entries for this with the disposal. Bank to disposal 55-55. P&L to disposal 5-5. Provision to disposal 40-40. Disposal to machinery 1 lakh 1 lakh. That's it. See this? How do you do it with disposal? With disposal is not something new. This is the entry. Bank account debit, P&L account debit, provision account debit to asset. I write disposal to asset. This is done. Then I write provision to disposal. This is done. Then I write P&L to disposal and bank to disposal. So basically this one journal entry is split into four journal entries. If there is profit, you will credit P&L. If there is loss, you will debit P&L. That's it. The only way to crack this right, become comfortable is pick one question. That question you first solve without provision for depreciation. Then same problem is solved with the provision for depreciation. Then same problem is solved with the disposal and provision for depreciation. I'll repeat, one problem you pick, solve this one problem without provision. Solve the same problem with the provision without disposal. Then solve one problem with disposal, with provision and disposal. Just one question. You take your own numbers and then solve it. You should be able to crack this. I have however added couple of questions for practice with provision for depreciation and disposal. You can watch that And if time permits, sometime soon I'll do that one question whatever I suggested you to do. If I can do, I'll come out with a separate video and do that part which can help you in your exam preparation. And this with regard to provision for depreciation and disposal.
Let's now begin the next chapter of your syllabus, chapter 6, which talks about bills of exchange and promissory note. When we start with bills of exchange, we cannot straight away start with the definition of bill. We have to understand several basics so that we get good understanding of the specific concept. Let's start with a simple cash transaction. What do you mean by a cash transaction? Cash transaction. What do you mean by cash transaction? Very simple. There's a guy and this guy sold the goods to customer. Customer gave cash. Cash transaction. What is cash transaction? We've discussed in the beginning theoretical framework. A transaction which is immediately settled by cash. Transaction which is immediately settled by, what is a transaction which is immediately settled by cash? Cash transaction. Next, let's discuss what is a credit transaction, wherein you sell the goods to your customer. Customer will tell, sorry, yeah, I don't have wallet today. I don't have money. Give me 2 months time. I'll give the money to you after 2 months. And you wait for 2 months. You wait for 2 months. After 2 months, when you meet your customer, you can't straight away ask for money, no. Like, hi, how are you? Casual conversation. When you say hi, how are you? So that you can ask next, where is my money? Your customer replies, hi, but who are you? Gone. Aura minus 1000. That you don't want it to happen. So when you sell the goods to your customer, you don't want them to cheat you, saying that you don't owe them anything. Yaru anta gotte illa. Who are you? I'm meeting you for the first time. You don't want that to happen. You want them to remember the goods that you gave. You remember that day I gave you goods, you collected goods, you forgot everything. Yeah, you don't want them to recall the memory by you bringing it up. So what you do is, whenever you give goods to your customer, that customer, you will give one paper. You will tell, sign this paper. Sign this paper. I will tell you. That's not promissory note. That is bills of exchange. ಹೇಳ್ತೀನಿ ಕಾಯ್ಬೇಕು. ಹತ್ತಿರ ಬೇಡ ಓ ಜೊತೆಗಾರ ಕ್ಲಾಸಿಗೆ ಬಂದಾಗ. Wait till I tell. I'll write 1st of December 2023. I will write date. Before that, I'll write oh, Moshri or whatever also if I want. After that, I'll write I unconditionally order you to pay me 10,000 rupees. When? After 30 days. I'll ask him to sign. He'll be like, no, can I touch the no, first to sign ako. ಆಮೇಲೆ box ಮುಟ್ಟು. After you sign only you can touch the, without putting the signature, don't touch the box. If he signs it and then he takes the box, I'll take the paper and keep it in my pocket. After 30 days, when I ask him for money, if he says, who are you? I'll be like, it's okay if you don't know me. You know this signature? You remember this paper? It's you who signed. Shut up and pay me 10,000. And it's okay if you don't recognize me. I don't care for the fact that you don't remember me, but I care for the fact that you don't remember that sweet transaction that we had that day. Yeah. So you ask your buyer to sign one document. Who prepared this document? Seller. Who signed this document? Buyer. Who will keep the goods? Buyer. Who will keep the document? Why can't we give the document with buyer? If we keep it with the buyer, he will tear the paper. Evidence should not be there. You get it? So that paper will be signed by the buyer and returned back to the seller. This paper in early English, old English, it's called bill. What do you mean by bill? Paper. What is bill? Paper. Used to say bill collector, meaning the person who collects the paper, invoices. So bill means paper. This paper is the only proof that that exchange of goods or services has happened between seller and buyer. Are you getting it? So we ask our buyer to sign this document and then give it to us. We'll keep it with us. This is the bill. Bill means paper. This is the paper which is the proof that this transaction happened between me and the buyer. I am seller. He is the buyer. I sold the goods. He purchased the goods. He has to give me money. I have to receive money. How do we get to know all of this? What is the proof that all of this happened? CCTV footage? No, that paper. That paper is the proof. Paper in English is bill. And this bill is proving that there is exchange of goods and services that happened. That's the reason it's called as bill of exchange. I hope you got it. In this, I have written, I am seller. I unconditionally order you to pay me or my order a sum of rupees 10,000 after 30 days. And he has signed. What's his name? What were we calling him? Buyer. What were we calling him? But what is his real name? Okay, I also have another real name. Everyone knows me by name Seller, but my secret name in Aadhaar card is Drawer. What is my name? So now let's discuss what is bill of exchange. This is a good scene setup for you to understand what is bill of exchange. Bill of exchange is an unconditional order. It's an made by drawer. Here, you see, is the word unconditional order there? What do you mean by unconditional order? When I give this paper along with goods, no. The buyer is telling, I will sign, but I want to change the date. He'll be like, no. Only place where you will touch the paper is where you sign. Like, okay, I will sign, but I want to change that 30 days, make it 45. No. Only place where you can touch the paper is to sign. He will say, okay, instead of 10, I want to make it 9. Like, no. You can place no orders. My order is unconditional. You cannot say, I will accept what you tell, but provided, no, 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 I don't want anything. But to, if, of, uda, nothing. Shut up and sign. Can you sign? Touch the goods. You can't sign? Leave. I'll keep my goods with me. You keep your money with you. You keep your signature with you. So only place where the buyer can touch the paper is for signature. And that's the reason we call it unconditional order. The buyer cannot place any conditions. Buyer has to accept the order. Who's making the order? Drawer. Who's making the order? Seller. Who's accepting the order? Buyer. Or also called as drawee. Observe this. So what is a bill of exchange? It is an unconditional. Who made this order? Drawer. Or also called as seller. Who accepted this? See, this is sent by seller. Seller's name is drawer. Seller's name is now buyer's name is called drawee. Who accepted it? Drawee. Sir, how do we remember? Very easy. Whoever is receiving, in their name there will be EE. Eascolor ಹೆಸರಲ್ಲಿ EE ಇರುತ್ತೆ. Who's giving the bill? Drawer. Who's receiving the bill? Drawee. He's eascoling the bill. In Kannada, eascoling means receiving. Whoever is receiving will have the word EE. Drawee is buyer because he is eascoling the bill. I hope you got it. And he signs. See, he has signed it. Should I sign or should he sign? He should sign. He has to pay money. Why should I sign? Full handwriting is mine. His handwriting is only one thing. I have black pen. He has blue pen. He has written only one word, signature. Rest everything I only wrote, no? So this is accepting the order. So it is an unconditional order made by the drawer, accepted by the. What did he accept? To pay a specified sum. Is there an amount mentioned? Yes. Check here. Have you mentioned the amount? How much? And when I prepare the bill, can I write, you have to pay me whatever I ask? Can you write like that? Give me everything. Yeah, give me, what was that? Something is there, something or everything. All that. No, you can't do all that memes here, okay? You would have to mention some specification 10,000, 9,000, 6,700, whatever number. You would have to mention that number. You can't tell everything or whatever I ask, how much ever I want, how much ever you have, no, how much, so much, not enough. Specified sum. And the next point, unconditional order accepted by drawer, sorry, drawn by, made by drawer, accepted by drawee to pay a specified sum. When? 2 points are there here. One, either on a specific date or at the end of specific period. Either on a specific date or at the end of a specific period. I can tell him, I want you to pay me 10,000 rupees on 1st of January. I can mention the date on which is supposed to pay. Or I want you to pay me 10,000 rupees after 30 days. I can either mention one specific period or a specific date. That's my choice. That's my choice. See, in this bill, have you mentioned a specific date or specific period? After 30 days. After 30, I hope you understood. Instead, could I have mentioned you have to pay me on 1st of January 2026? I can. 1st of January 2027. I can mention the date or I can mention the period. That's my choice. Can he change it? He has to unconditionally accept. And whom should he pay? He should pay it to me or whomever I direct him to pay. I don't want to see the buyer's face. Like, I don't even want to, don't pay it to me, pay it to him. If I show someone's face, he has to pay it to him. Or let's say I'm not in India, I'm gone on a holiday. I've gone on a holiday, where international holiday, Elige, Sri Lanka or Bangladesh. Or I saw Durandar movie, I'm so happy that I went to Khyber Pakhtunkhwa. Or I went to Baloch. I went. Now the buyer will be like, no, I'm like, I am not there. I'm in Pakistan. I might not come back. Pay it to my wife. No, I will give it to you only when you come. I'm like, no. If I direct my buyer to pay to somebody, buyer is obligated to pay to somebody. I hope you got it. So either on a specific date or at the end of specific period, to the drawer. I am the drawer. I am the one who ordered or his order. I have given my bill to somebody. So this is the bill. So I don't want to keep it with me. I have given it to somebody. So whoever has the bill, to the person who has the bill, my drawee has to pay. See, I mentioned that in the bill here. Read this. I unconditionally order you to pay me or my order a sum of rupees 10,000 after 30 days. Are you getting it? Very nice. And this is what the definition of bills of exchange. He pays, I receive. So who is calling the money here? Seller, drawer. So we call ourselves payee. They are called as payer. You understood? So the seller also has two more names. What are the other names for seller? Number one, drawer. Another name. What are the other names to buyer? Drawee or payer. Okay? Fantastic. By this, we've understood the definition of bill of exchange. There are several dates in bill of exchange involved. Bills of exchange means full date to date. Let's understand the meaning of these dates. Yeah. So let's start. What dates are involved in bill of exchange? Come on, wrong answer, everyone. What do you mean by date of drawing? What do you mean by date of drawing? Simple date of drawing. Drawing whatever date is made, that date. Whichever day you draw the bill, that is date of drawing. Whichever day you draw the bill, that is date of. How do we get to know? When I drew the bill, no, I would have written the date on the top. Come here. You remember this transaction? Date on which the bill is drawn by the drawer. You remember this transaction? Let's go into the bill. Focus on the bill. Then unlock your chakra. You go here. You see there, 1st of December, that is date of drawing. When I prepared the bill, what day did I prepare the bill? 1st of December. This is date of drawing. What is date of drawing? Date on which bill is drawn by drawer. Understood? Next, let's go to another beautiful date. Date of acceptance. What do you mean by date of acceptance? Date on which bill is accepted by drawee has to accept. No, how will drawee accept? Sign. Drawee has to sign. Where? At the end of the page. When the drawee signs, whatever is the date on the calendar, that is date of acceptance. See, date on which bill is accepted. That is by signing. By whom? Come on, quickly look at this. This is our example. In this example, if you observe here, do you see drawee's signature? What date is it? 3rd of December. That becomes date of acceptance. What is date of drawing? 1st of December. What is date of acceptance? Once again, date of drawing, 1st of December. Date of acceptance. Very good. Bill period is how many days? 30 days. Okay, let's progress. Focus on the next one. Date of drawing understood. Date of acceptance understood. Bill date. What do you mean by bill date? Maturity date. Bill date. Bill has to be paid. That is due date or maturity date. Wow. Bill ಮೇಲೆ ಬರೆದಿರೋ ಡೇಟ್. Bill ಮೇಲೆ ಎರಡೆರಡು ಡೇಟ್ ಇದೆ. Date of drawing is there. Date of acceptance is there. Which date among them is bill date? Depends upon the type of the bill. Bill date is the date mentioned on the bill. Correct. Bill date is the date mentioned on the bill. Correct. But what is it? There are two dates. One, the day I drew the bill, I've written my date and I've given it to him. Later he will sign. He'll write one date. In both of these, which date is bill date? I'll tell you one more statement. Let's see if you can get it right after that. Bill date is the date from which bill period is counted. You tell 30 days, no? You tell 30 days in this example. 30 days should be counted from one specific date. Now the question is, should we count 30 days from 1st of December or should we count from 30 days from 3rd of December? Various signs. From whichever date we should count, that date is called bill date. I'm not giving answer. I'm explaining you the situation. So what is bill date? The date from which bill period is counted. The date from which bill period is counted. Depends upon the type of the bill. There are two types of bill for the purpose of bill date. How many types of bill? Two types of bill. One, bill after date. 2. Bill after site. 1. Bill after date. 2. Bill after site. Bill after date means this is a bill from the date it is drawn. This is a bill from the date it is drawn. I prepared the bill on what date? 1st of December. 1st of December only this became bill of exchange. He will sign after 2 days. I don't care. You intentionally sign 2 days late. I will count bill period from 1st of December only. Then it will become bill after date. But I know he's a good boy. Like he's my customer, but we're very good friends. If we signed on 3rd December, there might be some genuine reason. So without even he signing, how can I count the period? It's okay, you signed 3rd December, I will count from 3rd December. That is bill after site. When did it become bill of exchange? After he sees. After he, when did he see? 3rd December. So I'll count 30 days from where? 3rd December. If I count 30 days from 1st December, it is bill after date. If I count 30 days from 3rd December, it is bill after. This depends upon the type of the bill. Bill date depends upon the type of the bill. What is bill date? The date from which bill period is counted. The date from which bill period is counted. Very nice. For bill after date, bill date is date of drawing. For bill after site, bill date is date of acceptance. Observe. In this case, if I mention bill after date, so how do we get to know? It will be mentioned in the bill. You see bill of exchange? You see the text there, bill after date? Now you tell me, what is bill date? 1st December. First, I'll count 30 days. Here, there, no. Some after, when should he pay? After, when do I start counting 30 days from? 1st December. What if my customer signs the bill on 3rd December? Still I count from 1st December. Even if he signs it on 3rd December, I'll start counting from. What if he signs on 29th December? I'll still count from 1st December. He signs on 29th, pays me money on 31st. I don't care. You signed late, your mistake. I want my money on my time. Understood? That is bill after date. What is bill after site? Bill date is date of. I'll start counting the bill period not on the date when I prepare the bill, but on the date when he signs the bill. See, is it bill after date or bill after site? Bill after, then what have I given? Draw E 3rd of December. So when I count bill period, should I count it from 1st December or 3rd December? This is bill after site. I hope you understood bill after date and bill after site. From when do we count bill period? From bill date. From when do we count bill period? From bill date. What is bill date? Depends upon the type of the bill. If it is bill after date, we count from date of drawing. If it is bill after site, we'll count from date of acceptance. Everyone understood this? Very nice. Let's go forward. You understood bill date. Now help me understand the next word, due date. What do you mean by due date? Due date ಅಂದ್ರೆ maturity date. ಅಂದ್ರೆ maturity date ಅಂದ್ರೆ ಏನು? Due dates. Then why is there two different words? There could have been only one, no? ಸಮಾನಾರ್ಥಕ ಪದ. Synonym. Synonym or anonym? Synonym. Anonym means? Oh, anonymous? So that is someone whom we don't know. Okay. Someone whom you know, synonymous. See, there is nothing like that. This English is like this only. Now tell ya, what's due date? At the time, Troy is liable to, throughout the Troy is liable to pay. Throughout there is liability. Due date, bills payable. Liability on that except due date or due date throughout. The balance sheet, in the balance sheet liability side, it's a liability throughout. Up. You are seller. You sold goods to me. I owe you money. I sign a bill for 30 days. I sign a bill for 1st of December. You sold the goods. 1st of December, I purchased the goods. I have signed the bill. Now, on 2nd of December, when I prepare balance sheet, should I write bills payable as liability or should I write it on 1st of January? 1st of December, 2nd of December also, it's my liability. It's my liability for the entire period. It is due for payment after 30 days. It is liability throughout the 30 days, but it is liability not due for payment. After 30 days, it will become liability due for payment. Are you getting it? Okay. What do you mean by due date? Due date is the date on which amount has to be settled. Due date is the date on which amount has to be settled. Now, what is the due date? Depends upon the type of the bill. What is the due date depends upon the. Tell me what are the types of bill that we have? Bill after date and bill after. That is types of bill for the purpose of bill date. Sir, this is there, no? Bill after date, bill after date. That is types of bill for the purpose of bill date. What are we discussing now? Due date. For due date, types of bill is different. Oh, acha. Yeah, it's different. What are the types of bill for the purpose of due date? Bill with specific date, bill with specific period. Bill with specific date, bill with specific. Sir, what is this? In the bill example that we took, no, what did we write? I unconditionally order you to pay me 10,000 rupees after 30 days. So, what did I mention? Period. In the definition, remember, it's an unconditional order made by the drawer, accepted by the drawee to pay a specific amount, either on a specific date, that is bill with specific date, or at the end of a specific period, that is bill with specific period. So, bill with specific period. Now, if you observe this bill, I mentioned 30 days. I mentioned 30, it is bill with specific period. It is bill with specific. So, here the due date is 1st of December or 3rd of December, whichever is the bill date based on the type of bill for bill date. That is bill after date or bill after site. Usually it is bill after date unless mentioned as bill after site. Let's assume it is bill after date. What date did I draw the bill? 1st December. From there you should count 30 days. From there you should count bill period. So if I take bill date and I add bill period to it, I will get due date. If I take bill date and I add bill period, I'll get due date. That bill date can be date of drawing, bill date can be date of acceptance. Bill date can be date of drawing, bill date can be date of acceptance. Either of it is possible. I hope you got it. So that if I add bill period, what do we get? Due date. What do I get? This is for bill with specific. What about bill with specific date? In that bill only I would have mentioned. For example, in this case, 1st of December plus 30 days. 30 is in the days column. 30 plus 1. 31st of December 2023 will become our, once again, right? Yeah. 31st of December 2023 will become the due date. What's due date? Bill date plus bill period. Bill period 30 days. Bill date 1st of December. Add them. 31st December 2023. What is that? Due date. Got this? This is bill with specific period. Now we'll go to bill with specific date. Same example, but I've changed the content in the bill. Observe. I unconditionally order you to pay me or my order a sum of rupees 10,000 on 31st December 2023. I mentioned 30 days. I mentioned specific. So, what is bill of exchange definition? It's an unconditional order made by the drawer, accepted by the drawee to pay a specified sum, either on a specific date or at the end of a specific. Is it at the end of a specific period? It is on a specific. What is the date? That is due date. 31st December is, everybody understood? This is bill with specific date, and 31st December will become due date. Due date is equal to specific date. When is it specific date? When I mention specific date. What if I don't mention specific date? If I don't mention specific date, whatever is the period mentioned in the bill should be added to bill date to arrive at to arrive at due date. How do we arrive at how do we arrive at bill date? It can be date of drawing, it can be date of acceptance. Depends upon the type of the bill for bill date. You understand how many types of bill do we have? Depends. For the type, for the purpose of bill date, there is bill after date, bill after site. For the purpose of due date, there is bill with specific date, bill with specific. Nice, Alva. Such a beautiful concept. Negotiable instrument Act 1881. Let's go to the next one. After due date. Next, maturity date. What is maturity date, sir? Can't style up. Yeah. Now can you see? Help me. What is maturity date? Due date plus 3 grace days. Beautifully told. Half right, half wrong answer. So you will all like Chaska Maska 50-50. You tell half answer right, half answer wrong. Again, Maturity date. I'll tell you the definition. Maturity date is the last date on which the drawee can pay the money without having to pay interest. Maturity date is the last date on which drawee can pay the money without having to pay interest. If you pay later than maturity date, drawee has to pay interest. Let's say I am your drawee. You are my drawer. You sold goods to me. I purchased goods from you. When I'm supposed to pay you money, on this last day, if I pay, no interest. If I pay tomorrow, you will charge me 1 day interest. That last day is there no final warning. Beyond that, I can't delay without having to pay interest. That is maturity date. That maturity date depends upon type of bill. That maturity date depends upon type of bill. If the bill is with specific period, then 3 grace days is given. If the bill is with specific date, there is no 3 grace days given. If the bill is with specific period, 3 grace days is given. If it is bill with specific date, there is no concept of 3 grace days. Now, on 1st of December, you sold the goods to me. When did you sell the goods to me? You told me pay the money within 30 days. I signed the bill. Now, what date do I remember in my mind? 1st of December, I remember. What is the bill period I remember? 30 days. I remember 1st of December, I remember 30 days. I don't know that 1st of December plus 30 days is 31st December. Did we ever talk 31st December? Was it written anywhere in the paper? No. You told me 1st December. You told me 30 days. It can happen, no, that I might not remember 31st December. So, if in case I don't pay money on 31st December, you call me and I'm like, shit, bro, I sorry, I forgot. Okay, I remember 1st December. I remember 30 days. I don't remember that 1 plus 30 is 31. Can I tell that? Valid reason. Valid reason. You invite me for your wedding. You say, sir, 15th January, Madhve Bandhudi. I'll remember 15th January. You will tell, sir, 15 days from today, it's my wedding. You please come. Then I won't remember the date. Are you understanding? So from next time when you have to invite someone, don't put 15 days to go, 14 days to go, 13 days to go. Don't put that. Put date. Put the specific date. You might have put 15 days to go today at 9 p.m. After 12 o'clock, it will be still showing 15 days to go. But actually it's become 14, no? Oh, hello? So, if you don't mention the specific date, I might not remember the date. So, on 31st December, when you call and ask money, I'm a good person, okay? I don't want to cheat. But still, I'm like, shit, bro, sorry, I didn't remember 31st December. I did not keep the money ready. Please give me little time. And I'll say, okay, I'll give you grace time. I'll give you grace. Grace time, it was actually not needed to give. I was supposed to pay by 31st December. When is the due for payment? 31st December. But because I did not pay, it is not fair on you to tell me Happy New Year, pay 1 day interest. Not nice. So you'll allow me 3 days time without having to pay interest. On 3rd of January, I should pay. If I pay 4th, no, you'll charge 1 day interest. That is 4th January's interest. So what is maturity date? Last day on which the drawee can settle the bill to drawer without having to pay interest. Without having to pay, you understood this? For bill with specific period, due date plus 3 grace days. Due date plus, for bill with specific date, maturity date itself is specific date. Maturity date itself is, that's it. That itself is due date. That itself is maturity date. There is no concept of 3 grace days. If I mention that you have to pay me money on 31st December, and both, like I draw it, I mention it, you sign it. You have to pay me on 31st December. Can you say you will pay 3 days later? No, you can, but I'll charge 3 days interest. I will still charge 3 days. Finally, did you understand maturity date? Everybody, now let's summarize the everything together. What are the types of dates that we have? Bill date, bill date, then due date. Yeah, due date. No, date, bill, date of drawing, date of acceptance, bill date, due date, and maturity. What is date of drawing? The date on which drawer signs the drawer draws the bill. Date of acceptance is the date on which drawee signs. What is the bill date? It is either date of drawing or date of acceptance. Depends upon the type of the bill. Bill after date, date of drawing. Bill after sight, date of acceptance. What is due date? The date on which bill is due for settlement. This depends upon the type of the bill. Either bill with specific period or bill with specific date. If it is bill with specific period, date of drawing plus bill period. What if it's bill with specific date? That date what is mentioned in the bill. What is maturity date? Last date on which amount can be paid without having to pay interest. It again depends upon the type of the bill. If it is bill with specific period, due date plus 3 grace days. If it is bill with specific date is due date, specific date is maturity date, there is no concept of 3 grace days. Sir, what if the maturity date falls on holiday? Then what to do? It depends upon the nature of holiday. The holiday can be a known holiday or holiday can be an unknown holiday. Holiday can be a scheduled holiday. Holiday can be an unscheduled holiday. What do you mean by scheduled holiday or known holiday? Under Negotiable Instrument Act 1881, every year one official list of holidays will be released. In that official list of holidays, if the holiday is mentioned, known or scheduled holiday. If it is not mentioned and suddenly there became a holiday, it becomes sudden holiday, emergency holiday, or unknown holiday. I hope you got it. How many known holidays are there? These many are there. These many are there. Many holidays are there. We don't know. We have to check it every year. Suddenly, one year they added Purandara Das Jayanti also as holiday. Can it be added? Yeah. They added Mahalaya Amavasya also as holiday. Can they add? Yeah. Good Friday right now is not a holiday. They added Good Friday. Okay, they can add. They can remove some day also as a holiday. Yeah. Next year they want to add Children's Day as holiday. Let them add 1st of January. Happy New Year. They want to add. Can they add? Yeah. It is to be taken as a decision every year when the schedule is announced. There is no fixed dates as holiday. But we can remember some days as known holiday. Other than that, it's an unknown holiday. Usually this will be mentioned in the question. What are known holiday? We can take 26th of January, Republic Day, 15th of August, Independence Day, 1st of April. Why 1st of April? Fool's Day? No, beginning of financial year. 30th of September, half yearly closing. All Sundays can be considered as a known holiday. Are you getting it? Sir, 25th of December. Sir, 14th of February. Sir, 14th of January, Makara Sankranti. No, don't consider them as holiday. Sir, you are so biased, sir. How can it be not holiday, sir? Christmas. I am not telling you it's not holiday. Who am I to decide what's holiday, what's not? I am telling you don't consider it as holiday unless it is mentioned in the question. They'll give 21st of February. What will you do? I think 21st February ಏನಿದೆ ಹಳೆದು ಬರ್ಡೇ ಇದೆಯಾ 21st of February is Mahashivratri. How would you remember? Yeah, you can't. So I'm telling you, don't remember all these dates. If they mention in the question, it is holiday. If they don't mention, it is not a holiday. But 26th of January every year Republic Day. Correct? No. 15th of August every year Independence Day. 1st April every year opening of books of accounts. 30th September every year half yearly closing. 2nd of October Gandhi Jayanti every year. Take it. This thing you take it. Don't take anything else. You get this? Sir, Sunday should I remember all Sundays? No. If they mention it's a Sunday, you take it. If they don't mention it's a Sunday, don't take it. Other than these, if there is any other holiday, it is unknown holiday. Other than this, if there is any other holiday, it is. I hope you understood. Very nice. Let's proceed. After knowing this holidays part, if it falls on a known holiday, you know that that day was holiday. Pay one day before. Pay one day before. The day before before that date only will become maturity date. Let's say you took that bill date, bill period, everything you added, it came to 15th of August. When should you pay money? 14th. Sir, 14th of August is Sunday. 13th. You understand? Sir, 13th is some unknown holiday. 13th is some unknown holiday. Yeah. 13th of August is, 15th is Independence Day. So it becomes 14th, maturity date the day before. 14th is Sunday. Then it will take 13th. 13th is some bandh, strike, unknown holiday. Then what do you do? Allah. When you tell unknown holiday, it is next day, no? You get it, no? 12th in the ಮುಂದಕ್ಕೆ ಅಂತ ಹೇಳಿದ್ರೆ 13th 12th ಹೇಳಿದ್ರೆ 12th 13th ಹೇಳುತ್ತೆ will be like 12th 13th 12th 13th 12th 13th where will you start 12th midnight 12 o'clock where it's neither 12th nor 13th you have to settle no the moment it falls on an unknown holiday it will get postponed to next working day. So if 12th is some unknown holiday, it will not fall to 13th. It will fall to next working day. 13th Sunday, 14th Bandh, 15th Independence Day, 16th again Sunday. How can 2 Sundays come back to back? Let's say 16th some Bandh. One day will work no after that. That day. Sir, 17th is Varamahalakshmi. Oh, it's okay. Yeah? After that, someday you will work. No, it's postponed to that working day. Next. So for unknown holiday, they won't say next day. What is the language? Next working day. For known holiday, the day before this. Are you getting it? Don't use your knowledge for Sunday at all. Let's say they mention 12th of August is Sunday. 12th of August, take it as Sunday. You tell like, sir, 12th of August, she ditched me, sir. I remember that day is not Sunday, that day is Tuesday. Don't use your knowledge. If they tell it's Sunday, it's Sunday. If they don't tell it's Sunday, it's not a Sunday. You remember some date that it is Sunday. That question came in the question. Do you remember use your knowledge Sunday? No. Unless they mention it's not Sunday. I hope you understood the days concept. Pakka. Sir. One point that I want you to note. This days concept, whatever is there, no. Known holiday, unknown holiday, next day, previous day. All of this will be applied only and only if such bill is bill with specific period. Only if it is bill with specific, I mentioned the bill 15th of August. You sign. You sign no 15th of August. Pay on 15th of August. It is Independence Day. I don't care. You saw no date on the bill. Due date 15th of August, maturity date 15th of August only. So three grace days concept is given only and only if it is bill with specific. If it is not, if it is bill with specific date, no three grace days. Due date will be maturity date. Due date will be, and even if it is bill with specific, bill on demand, bill on site, bill on presentment, again then there is no concept of three grace days. What is bill on demand? Three words, all three mean the same. One, bill on demand. Two, bill on site. Three, bill on presentment. Remember the names. I'll make you write that. Observe here. So types of bill based on bill date. Two. What are the two types of bills based on bill date? Bill after date, bill after site. For based on maturity date, bill with specific period, bill with specific date, bill on demand, bill on site, bill on presentment. Bill after site is different from bill on site. Bill on site, bill on demand, bill on presentment. What does it mean? I am your customer. You am my supplier. Who are you? Supplier. Who am I? Customer. You are seller. I am buyer. You are drawer. I am drawee. I am payer. You are payee. You give the bill to me. In that bill, you did not mention any date. You did not mention any, not bill date. After 30 days or on 31st of December, you did not mention any date. You did not mention bill period also. You did not mention bill period also. But you mentioned on demand, on site, or on presentment. You mentioned it. You know what does it mean? We are very good friends. We don't want to take appointment to meet each other. You don't want to mention to me after 30 days on 31st December. Nothing. I signed the bill. You keep it with you. Whenever you want money, you will call me and ask, bro, I need money, bro. I'm like, hey, come off, bro. What you and all call and all. What you putting scene? Come, I'll give you money. Whenever you call, you come, I'll give you money. Or whenever I have money, I will only call you and then say, okay, Macha, I remember that day I took goods from you. Money is there. Yeah, come and collect. I'll tell you, come and collect. So whenever I have money, I'll give. Or whenever you want money, I'll give. We're in good terms. You understand? This is bill on demand. Whenever you demand, I will give. It might be after 1 week, it might be after 10 days, it might be after 30 days. It might be after 2 months also. That is bill on demand. When the drawer demands, drawee has to pay. Bill on site means what? When the drawer shows the bill, drawee has to pay. Bill on presentment. Whenever you send the bill to me, I will pay. Bill on demand, bill on site, bill on presentment. Are you understand? We both are good friends. You ask me for money. I'll tell like, okay, hey, full tough scene, bro. No money here only. I'm only running low, no risk. Like, okay, fine. Pay me next week. I'm like, okay. Suddenly you see me chilling with friends. I'm going bowling. I'm eating nachos. Oh God, I'm drinking matcha. I'm eating Korean bun. I'm watching this. Like full fancy. You know, say, hey, this guy is fancy, spending a lot of money. You'll say, pay me money now. I cannot say I'll pay after 3 days. No, I have to pay today. Why? It's bill on demand, bill on site, bill on presentment. Friendship broken, pay money instantly. That is bill on demand, bill on site, bill on presentment. I hope you got the concept here. Very nice. Then all of this what we discussed so far are all trade bills. What are they? Trade bills. This is the same thing. Again, I'm giving you the meaning. We are done with this. So, okay, done. You are seller. Who are you? Who am I? You sold goods to me. I bought goods from you. I sign the bill. I give you the bill. You have the bill with you. You get this? Now, we'll do accounting. Before that, little, I'll take about 5-10 minutes and then run you through the computation of dates. How do you compute dates? How do you compute dates? For that, due date computation, bill date computation, bill period computation, and then maturity date computation. Shall we run through that part quickly? It's time. Quick recap here. Quick recap. See, whenever this is given somewhat like this, see here, bill is payable after 3 months. Bill is payable after date of drawing is 1st of March 2025. Date of acceptance is 6th of March 2025. When do I count 3 months from? Depends upon the type of bill. It can be from date of drawing, it can be from date of acceptance. Depends upon the type of bill. What type of bill is this? Nothing is mentioned. Nothing is mentioned. I'll assume bill after date. If it is bill after site, it should be mentioned. Otherwise, it is bill after date. I'll take 1st March 2025. What is bill period? 3 months. Add 3 months. Date column, nothing will change. 3 plus 3 becomes 6, 2025. What is the due date? 1st of June 2025. Will I add 3 grace days or will I not add 3 grace days? I'll add 3 grace days only and only if it is bill with specific period. Here is there a specific period? Add 3 months, it will become maturity date. Sorry, add 3 days, it will become maturity date. Got this? Let's go to the next one. It is due date and bill after site. Bill after, so date of, see in the bill also you can see bill after site. Do you see there? Date of drawing 1st of March, and when the drawing is signing on the calendar it is 6th of March. So I'll count 3 months from when? 6th of March. Bill date becomes 6th of March. I'll add 3 days. 3 plus 3 becomes 6. This remains 6. Date column nothing change. It will become 6th of June 2025. That is the due date. I'll add 3 grace days. Why am I adding 3 grace days? Because it is will be specific period. If I add it will become 9th of June 2025. I hope you got it. It's very fast. Next, due date and maturity date for bill with specific date. This is Putta, this is Putti. Putta has sold goods to Putti. Putti has accepted the goods. And 1st of March is when the bill is been drawn by Putta. And 6th of March is when Putti has accepted the bill. But in the bill, they mentioned the date 31st May. Have they mentioned the date? Yes. Now, date of drawing 1st of March, date of acceptance 6th of March. Nobody cares. Nobody cares. Yeah, bill date might be 1st of March only. But bill period, it's not there. It's bill with specific date. What is the date? 31st May. 31st May is the due date. 31st May is the maturity date. There is no grace days. Why? Because it is bill with specific date. We will not add grace days. We will not add. Come to the next one. Due date, maturity date, and bill is given after date. Date of drawing 1st of March. Date of acceptance 6th of March, and it is bill with bill after date. It is bill after date. So I'll take 1st of March or 6th of March. Bill after date, no. So I'll take 1st of March. Add 3 months. 1st of June 2025. Am I right? I'll add 3 grace days. It will become 4th of June 2025 as maturity date. Difficult. Got this? Let's make it slightly interesting. Now, we have not mentioned 3 months. We have mentioned 90 days. Remember, 90 days doesn't mean 3 months. 1 month doesn't mean 30 days. 1 month means 1 month. 30 days means 30 days. Are you getting it? If they give days, add in the days column. If they give months, add in the months column. If they give months, don't convert it to days and then add. Because a single month can be 28, can be 29, can be 30, can be 31. I can give you examples. February can be 28, February can be 29 days. 30 days, February can never be 30 days. January 30, no possible. March, no. April 30. Correct or not? June 30. July, August 31. September 30. November 30. Are you getting it? Again next year. Are you getting the same thing? Cool. Now, is this bill with specific date or bill with specific period? Period. 90 days. And they've not mentioned anything. I'll take it to be bill after date. Bill after date, no. Sorry. Bill after site. Is it mentioned? Okay, mentioned. So I'll take 6th of March. When I take 6th of March, I'll add 90 in the days column. Don't assume 90 means 3 months. No. 90 plus 6. 96th of March 2025. Is there 96th day in March? No, chichi. Add 3 grace days also. It will become 99th March. 99th illa. March has how many days? March has how many days? 31 days. So 96th of March 2025. After 30 days in March, it will go to next month. So deduct 13 days column. Add 1 to months column. Check. Okay. See, deduct 30 in days column. Add 1 in months column. So after 30, how many days are left? 96 minus 30. It will become 66. 66th of April 2025. 96th of March is nothing but 66th of April. Sir, select it. Sir, 66 is not there in April. Okay. How many days are there in April? After 30 days in April, it will become May. So I deduct 30 days in April, add 1 to months. You do in numbers, no? Deduct from the previous number, take it to this number. So here, days, if it becomes too much, it will become months. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 28, 29, 30, and it will become 1 month. 1 month, 1 day, 1 month, 2 days, 1 month, 3 days, 1 month, 4 days, 1 month, 29 days, 1 month, 30 days. It will become 2 months, 0 days. So if it becomes more than that many days in that month, it will go to months column. Are you getting it? So from 66, you deduct 30. It will become 36th of May 2025. But May has only how many days? After 31 days in May, it will become June. So deduct 31 from 36. 31 from 36. You will get what date? 5th of June 2025. Are you getting what I'm trying to tell? Say something. So if you add 3 grace days, it will become 8th of June 2025 as maturity date. You understood how to compute when it is days? Say something. If it becomes 13 months, then what do you do? 12 months is this year, 13th month is next year, no? So deduct 12 year and make 2025 as 2026. Simple. Sir, if in case ವರ್ಷದಲ್ಲಿ ಅಧಿಕ ಪ್ರಸಂಗ ಮಾಡ್ಬಿಡಿ. ಅಧಿಕ ಮಾಸ means there will be one more ಅಮಾವಾಸ್ಯೆ ಅಷ್ಟೇ. ಇಲ್ಲಿ ಅಧಿಕ ಮಾಸ ಅಂದ್ರೆ 13 months ಬರಲ್ಲ. Every year will have how many months? 12 only, no? Will any month have 13 months? Keep me posted. In my calendar, though, I don't see. Just quickly glance through this. Let me know if you can understand this. 31st of the month, date of drawing. Bill period is 2 months. When I add 7 plus 2, it becomes 9 months. And here 31st, no. I can write 31st of September. No. So 31st of September cannot be written. So shall I write 1st October? No. We are starting from end of July. Starting from end of July, 2 months is end of August, end of September. It can't go to October. If it goes to October, it will become 3 months. From end of July, 2 months is end of September. Got this? And then you add 3 grace days, that will become 3rd October. However, if in case you're starting with 30th of June 2025 as bill date and you add 2 days, can I write 30th of June is end of June? June has 30 days or 31 days? 30 plus 2 months, end of June, end of July. Can I write end of August, 31st of August? I should write 30th of August. Why? If the corresponding day is there in the next month, take that day. If the corresponding day is not there, then you take end. Here, 31st is the date. Is 31st there in September? So you take the last day in the year, last day in that month. Here, what is the bill date? 30th. Is 30th there in August? Yeah, take 30th. Don't take 31st. Don't take Pakka. On 1st of January, if you issue 1 month bill, 31st of January, if you issue 1 month bill, when is it due? 31st of February, 28th of February. Are you getting it? What if you issue bill on 28th of February for 1 month? 28th of March. It will not become 31st of March. Now on 28th of February, if you issue 1 month bill, when will it be due? 28th of March. Why? 28th is there in March. On 31st of January, if you issue 1 month bill, it will be 31st of February. Because 31st February is not there, you will take 28th or 29th that is there in that year. So don't tell, sir, I'll take 28th, 3 days I'll take in March. No. From January to March is more than 1 month. Bill is for 1 month. How can you take March? It is due in February. If the corresponding date is there, good. If corresponding date is not there, then the last day in that month. Okay? Say something. Fantastic. Then let's see this. This is bill after sight with period, and there is one public holiday. Interesting. So date of drawing 10th May, date of acceptance 12th May. What is the bill date? It's bill after sight. So I'll take it as 12th of May. Am I right? Then help me out. Bill period is 3 months. 5 plus 3 becomes 8. 12th of August 2025. Add 3 grace days. Maturity date becomes 15th of August 2025. We know maturity date is falling on Independence Day. So what do we do? Next day? No, previous date. 14th of August will become the revised maturity date. Everybody got it? Help me with the next one. So date of drawing 10th May. Date of acceptance 12th May. Bill is after signed. So I'll take bill date as 12th of May. Bill period is how much? 60 days. Add 60. 12 plus 60. 72nd May 2025. Is there 72nd May? How many days are there in May? Deduct 31. Beyond 31, it will become June. If you deduct 31 from 72, what do we get? 41st of June. Is there 41st June? How many days are there in June? 30. After 30, it will be July. July, no. 11th of July. 11th of July is there? Yes. Add 3 days. Grace days. 14th of July 2025. It's mentioned in the question that 14th of July is an unforeseen holiday. Emergency. So what do we do? 15th July. Shall we go to 15th July? 15th July is Sunday. 16th July. Sir, 16th July is Independence Day. India. Allah. So 16th July is considered as the revised maturity date. Does it help? I've given 3-4 points for you to read. I hope this will be helpful. I'll give you 2 minutes. Quickly read this. People watching online can pause it and then read this. Yeah? Read this down. Very good. I'm glad you people have understood. Now let's get into accounting. The accounting that can be done depends upon the options that is there with the drawer. Who is drawer? The seller. Who is drawer? You are the seller. You decide the accounting that you should do. You have how many options with you? You have 3 options. How many options? Actually, fourth one, the space is not sufficient. Fourth one is sending bills for collection. Fourth one is sending bills for. So option number 1, holding the bill till maturity. Option number 2, discounting the bill with banker. Option number 3, endorsing the bill. Holding the bill till maturity means you will keep the bill with you and you will wait till the day it matures. So drawer keeps the bill with them till the date of maturity. So in this case, what should be the accounting entry in the books of drawer or seller? What is the accounting entry in the books of drawee or buyer? We'll quickly see it. Now, when the goods are sold by the seller to the buyer, what is the entry in the books of seller? Buyer. Buyer's another name. Drawee. Drawee account debit to sales. What is the entry in the books of buyer? Purchase account debit to drawer. Got it? Then drawer will give the bill. Drawee will sign the bill. See here, drawer will give the bill. Drawee will sign the bill, and it's given back to drawer. Now, to drawer, against this bill, money is receivable. Can I say to drawer, it becomes, to drawer, it becomes bills receivable and asset. He will debit bills receivable account. He will credit whom? Drawee. Entry will be bills receivable account debit to. What is the entry in the books of drawee? Drawer account debit to bills payable. To him, it's a liability. Understood? Then let's go to the next one. On maturity date, what will be the accounting entry? On the maturity date, me, drawer, I will give the bill and I'll collect the money. Cash account debit. If it is honored, cash account debit to bills received. What about the other party? He will pay the money. Bills payable liability will decrease debit. Cash account asset will decrease. Got this? What is the entry on the maturity? See, this is what will happen. Money is paid. Drawer gives the bill. Drawee gives the money. What if drawee doesn't give the money? Then it will become dishonored. What is it called? What is the entry on dishonor? I will give bills receivable credit, but he will not give money to me. Cash account will not be debited. I will first prove that this is the guy because of whom all of this happened. I will take to notary and make him sign saying that this guy is not paying money. What will I do? I'll take it to notary and then I'll tell him you send notice to him. Notary will send the notice to drawee saying that your drawer is saying that you are not paying him money, pay money. If the drawee pays the money, good. If drawee doesn't pay the money, notary will put his seal and signature saying that yes, drawee did not pay money. Then that will become evidence using which drawer can sue drawee in the court of law. If you don't do noting, you know what will happen? You are drawer. I am drawee. You are supposed to receive money. I am supposed to pay money. On the maturity date, I told I will not pay. You will go to court. You will submit the paper and you will tell that I have cheated on you and I have not paid money. Judge will ask, why did you do this? I say, sir, I will pay money. Then judge will say, what is the case? Nothing, sir. I never told I did not pay money. I never told that I will not pay money. Then it's like waste of court time, no? So you should prove that I did not pay. How will you prove that? I don't know, sir. Promise. Sir, mother promise, sir. This guy told he will not pay. You can't do that mother promise in the court. You would have to put a case on me only when you are having the evidence that I did not pay. How do you get evidence? You will ask me. If I don't pay, you will take it to notary and notary will send me notice saying that pay the money or see you in court. If I pay, case closed. If I don't pay, I would have to meet you in court. So when that notary you go and then give the evidence document, no, for signature, they will charge you money. That money what you pay, you are going through all that process because of me. You will pay that expense, but it should be borne by me. Because of me only noting charges come. Whose responsibility to bear? Drawee. But drawee will pay the noting charges. Will I pay the money when you go to court against me? Like why will I pay your fee? You will pay, but you later recover it from me. ನನ್ನ ಮೇಲೆ ಕೇಸ್ ಹಾಕಕ್ಕೆ ನಾನೇ ಏನಕ್ಕೆ ದುಡ್ಡು ಕೊಡ್ತೀನಿ? First you will pay, then I will reimburse. Are you getting it? So when you pay noting charges, it is expense. Noting charges to cash. After this, I would have to pay you money for the bill and for the noting charges. Both. That's the money that I owe you. To you, I am an asset. And to me, you are a liability. I will write bills payable hoitu, noting charges bantu. Together, I have to pay you money for bills payable and noting charges together. Entry on honor, entry on dishonor. I hope you got it. Yeah. Identify the transaction, identify the drawer, drawee, and then pass the journal entry. This noting charges being my expense, I'll transfer it to P&L. I'll transfer it to P&L. Who am I? Drawee. Got it? By this, we are done with accounting in the case of holding the bill till maturity, and entries that I explained is in the books of drawer as well as in the books of drawee. Let's go to discounting bill with banker. Now, whatever bill I sign and give it to you, you have an option. If you want, you can keep that bill with you, wait till maturity date and collect money from me. Second one, you need not keep it with you till that date. You want money immediately. You can go to banker, you can give the bill to banker will give you money immediately. But banker will wait till the maturity date and collect money from me. Why will banker wait on your behalf? Because banker expects some charges. If the bill amount is 10,000, when you take it to the banker, when the banker gives you money, banker doesn't give you 10,000. Banker gives you 9,500. Banker collects from me 10,000. That 500 rupees is banker's charges. How do the banker decide? Based on the amount, based on the interest rate, based on the time period. Based on the amount, based on the interest rate, based on the due to P into T into R. Principal amount, time period for which the bill is yet to be matured, and rate of interest. That's how we find the discounting. In discounting, there are three parties. One is you, drawer. One is me, drawee. Third one is banker. But we will not see accounting entries from the perspective of banker. Okay, can we see this? Same. Sale entry, purchase entry, same. You draw a bill on me, I sign, you accept, you receive, everything same. When you discount the bill with banker, this is the entry. You receive money from the bank account debit. Banker cuts discounting charges, expense debit. Two bills receivable. Bills receivable credit 10,000. You receive 9,500 bank account debit. 500 what you don't receive discounting charges debit. I hope you got it. On the maturity date, you will not receive money. Banker will receive money. You write no entry on the maturity date. Banker will write the entry, but I will write the entry. To me, it doesn't matter whether the bill is with you, whether the bill is with banker, or it is endorsed to your creditor. Entries in the books of drawee will not change in any case. Entries in the books of drawee will not change in any case. It's the same in my books. Whether you hold the bill till maturity, whether you discount it, or you endorse it, or you send it for collection. I hope you got it. So I'll write the entry as I will write the entry as bills payable to cash if I pay. If I don't pay, bills payable debit, noting charges debit to drawer, P&L to noting charges. To you, if the bill is honored, banker will collect, you don't have to write any entry. If the banker doesn't collect the money, if I tell the banker poda, then banker will come to you and collect money from you. You have to pay money to banker. For that, the entry is bills receivable debit, noting charges debit to bank. You pay banker, you pay notary, and you collect the bill from the banker, and noting charges is booked as expense. And once you write this, you'll pass it to me. I hope you got this. Cool. Then you have another option with you. What is it? I owe you money. You owe money to your supplier. You are waiting to collect money from me so that you can pay your supplier. If I don't pay money to you on time, you can't pay money on time to your supplier. Do you agree with me? Your supplier is putting pressure on you. You're like, wait 1 month, the bill will mature, I'll give money. Wait 1 month, the bill will mature, I'll give money. He's not listening. So what do? You take that bill to you take this bill. You only collect from my customer directly. That is endorsing. You are drawer. I am drawee. You are drawer. I am drawee. Your supplier is there, no? To your supplier, you will give the bill what I give you. I gave you one bill of exchange, which you prepared, I signed, you will give that to him. Your supplier will collect money from me directly. I pay your supplier money directly. You giving the bill to your supplier or creditor is called as endorsement. In this process, you are giving the bill, you become endorser. You become endorser. Your supplier becomes endorsee. What does you become? Now, look at this endorsement concept. In this, we need to see accounting from three parties' perspective. Okay? To you, what is it? Sale. What is the entry you will write? Drawer to sales. To me, it is purchase. Purchase to supplier. Sorry. For me, it is no correct. Oh, this is your supplier selling goods to you. Your supplier sold goods to you. For him, it is sales. What will he write? Drawer to sales. For him, it is sales. For you, it is purchase. Purchase to supplier. You sold it to me. You will write draw e to I purchased. I write purchase to draw. Then I will accept the bill that you gave me. So I will write draw e to bills payable. You will write bills receivable to draw e. This bill you give it to your supplier. So you write supplier to bills receivable. Supplier liability decrease, debit. Bills receivable, asset decrease, credit. That bill will go to him. He will write bill received, no. Bills receivable account debit to drawer. Got this? Say something. On the maturity date, if the bill is honored, your supplier will collect the money, I will pay the money. You will write no entry. See, in my books, bills payable to cash. In his books, cash to bills receivable. If it is not honored, I will disrespect him. He will come throw the bill on your face. You will come throw the bill on my face. So it will come as a loop. First, I won't pay. He will ask you for money. He will pay noting charges and he will recover money from you. What will he recover from you? Bills receivable money and noting charges. When it comes to you, what do? You will not keep it with you. You will collect it from me. I am supposed to pay you. Are you getting it? Same entries, but now it will become three parties. So practice entries a little and think it at logical level with asset liability expense statement, and you should get this right. We just learned accounting for bills of exchange, entries if the bill is held till maturity, if the bill is discounted, if the bill is endorsed. I hope you understood. As a drawer, you have another option with you. What is it? Send it to bank for send to bank for what do you mean by send to bank for collection? You don't want to keep the bill with you right now because it's not safe. What if the bill gets lost? What if the bill gets torn? What if you forget the maturity date? You kept the bill. You have to collect money on 31st January. You forgot. 31st January over. You don't remember. February over. You don't remember. April suddenly you say, oh, sure, this bill matured in January only. There are two problems. One, you might forget the maturity date. Two, you might misplace the bill, tear the bill, lose the bill, or it might get burnt. So what do? You give the bill to banker. You give the bill to banker will not give you money immediately. If the banker gives you money immediately, it is discounting. What is discounting? See, in discounting, you give the bill to banker. Banker is giving cash. Do you see? Same date, 15 July. But here, you are giving the bill to banker. Banker is giving you one receipt saying that you have given the bill. Banker will keep the bill with him till maturity date. On the maturity date, banker will collect the money from me and then give it to you. If you discount the bill, when do you receive money? Immediately. When you send the bill for collection, when do you receive money? On the maturity date. It's just an advantage of services taken from the bank. I hope you understood. If in case you send the bill for collection, what is the entries that you should write? One moment. Yeah, when you send, what is the entry you will write? You will write the entry bills for collection account debit to bills for collection account debit to bills receivable. Are you getting it? I will not write any entry. I don't care whether you send it to bank, whether you give it to banker, discount it, endorse it. I don't care. On the maturity date, if you receive money, bank to bills for collection. If it is dishonored, banker will give the bill back to you. So you give that bill back to your customer. You understand? You will receive the bill back from the banker and you give it back to your customer. She is crying because she doesn't have money. Putta is drawer, putti is drawing, and we have Appi. Appi is actually our endorser. Sorry, endorse. Endorse. He is receiving the bill. Supplier. Appi. Yeah, I hope you understood. Then Couple of things to note. One is with regard to the concept of dishonor. Whenever the bill is dishonored, there are two, three things that can happen. One, the customer will say he will not pay money, or customer will say I will pay later. If the customer say that they will pay later, it's called renewal of a bill. If the customer pays the money before maturity date, it's called as retirement of the bill. If the customer says that they can't pay the bill, it's called insolvency. Three things. One, customer says that they will pay, but later date, it is renewal. If the customer pays before the maturity, retirement. If the customer says I can't pay, insolvency. Are you getting it? Let's say I am the customer. I am telling you I'll pay later. I'll pay after 2 months. 2 months delay is there, no? You should wait for 2 months. We'll sign one new bill. In that new bill, you will charge me interest also. Old bill amount plus interest. Old bill amount plus that interest can be included in the new bill. Can be paid by me in the cash. Either ways is possible. That interest amount can be included in the new bill or can be paid in cash. Pakka? Now, that interest amount, if it is given, good. If the amount is not given, P into T into R. P, amount of delay. T, months of delay. R, rate of interest. Now, let's say you have raised a bill on me for 10,000 rupees. 3 months due date. 3 months is the bill period. I did not pay after 3 months. It became maturity date, dishonored. I pay 4,000 rupees cash to you. 6,000 I say I don't have, will enter one new bill. Now, will you compute interest on 10,000, 4,000 or 6,000? 6,000. 10,000 is the bill amount. How much did I give you cash? 4,000 is honored. How much is dishonored? On 6,000 only interest will be computed. New bill is 2 months. Old bill is 3 months. On what period do you compute interest? New bill period, 2 months of delay. That interest you can either collect from me in cash now, or it can be included in the new bill and it will be paid on the maturity date. Are you getting it? That interest is income to drawer, expense to drawee. Income to drawer, expense to. Understood? Let's go to the next one. What is retirement of the bill? Payment is made earlier. We are supposed to settle the bill on 31st March. You raise the bill on 1st of Jan. 3 months time. I'm paying you on 28th February only. Enjoy. I'm paying you 1 month before. Are you happy? You should make me also happy. How? You should give me discount. I'm paying you 1 month before. You should give me discount for 1 month. Discount if they give amount, very good. If they don't give amount, it is bill amount multiplied by rate at which discount is given multiplied by period before which the settlement is done. If you compute that, you will identify discount amount. Let's say discount came to 500 rupees. Bill amount is 10,000. Bill is 10,000. If I pay 31st March, if I pay 28th February, I should pay you 9,500. I pay 500 less, to me income, discount received. To you expense, discount allowed. I hope you understood. Last one, insolvency. What do you mean by insolvency? Insolvency is a case where I cry. I cry. We do a lot of questions on how to compute that interest amount. Now let's see. Retirement. Insolvency. Ayo, I don't have it here. Fine, it's there in another sheet. I cry. I'm like, ayo, I don't have money. I'm crying. Putti is crying because Putti does not have money. What will you do? Then it's bad debt for you. What is it to you? You will write my name credit. I am your asset. I owe you money. Now I am no longer giving you money. If I give you money, cash to Putti. If I don't give you money, bad debt to Putti. We'll write bad debts account debit, expense. You got it? To you, bad debt is expense. To me, it's called deficiency, income. I owe you money. When I pay you money, entry is putta account debit to cash. If I don't pay money, putta account debit to deficiency. It is like income to me. It's like income, and that's how I close my accounts. I hope you all understood this. Very good. They can give mixed journals. They can mix one dishonor, discounting, renewal, retirement together. Don't get confused. Like how you see individual superstar movie, it's just that 3, 4 of them together and become a multi-starrer Avengers movie. Be ready for it. Don't just expect one movie with Captain America or Iron Man or Spider-Man. All of them together also can come. Don't let that be your end game. Yeah, let that be one of the movie in the series, not the last movie, and you will be able to handle it. The last thing that you like the most, accommodation of bill. See, throughout what is happening is there is purchase, there is sale. For that, there is bill. That is called trade bill. What is it called? Trade bill. What do you mean by accommodation? Accommodation is where there is no purchase, there is no sale. I also have not bought goods from you. You also have not sold goods to me. You want money from me. I want money from you. We are asking each other for money. Both of us don't have money. So what do? We make one financial arrangement. You will raise a bill on me. I will accept the bill. Do I owe you money? No. You will take the bill to banker, discount it. Banker will give you money. We will share both of it. You raised a bill on me for 10,000. I accept. You take the bill to banker. Banker will give you 9,000. 4,500 ninge, 4,500 nange. Why did we do this? I went to bank and asked for loan. They told, Ogo, loan. You went to bank and asked for it. They told, Ogo, loan to you also. Both of us are hurt. So both of us will take bill of exchange. They'll make us sit, turn on the AC, give us fruity, give us 4,500 each and send. Let's say, give us 9,000 and send. We share 4,500, 4,500. On the maturity date, bank will ask you for money or bank will ask me for money. Bank will come to me and ask money. How much? 10,000. 10,000. When they ask 10,000, I'll say 1 minute to the banker. Come inside. I will call you. They've come here. Send 5,000. You will send 5,000. I'll put 5,000. Together I pay 10,000. Over. Deal close. I can't tell the banker no. My friend is not lifting the call. I'll give my share of 4,500. His share of 4,500. You ask him. Banker should not know this. Yeah, इस idea India से बाहर नहीं होना चाहिए. He has to stay here. It's our idea. You got it? What if that day you give me hand, you don't pick the call? Then I pay full 10,000 to bank. How much is my money? 5. 5 money you are supposed to pay. You did not pay. I paid. What will I do? We will enter into a new bill. I will draw a new bill on you for 10,000. You will accept. I will go discount, collect money, and both of us will share. On the maturity date, banker will ask you money. That day I will give you little, you put little from your pocket and then pay. If you don't pay, banker will come back to me. I would have to negotiate man once again. That day bad debt is possible. So don't see accommodation as something brand new. Same discounting, sharing the money, raising the bill, same entries, but there is no purchase sale transaction. Always remember to do one beautiful working note before you do questions on accommodation. Yeah. Do ask me, let me know in the comments if you have problem with accommodation. I've done another video. I'll share the link of that video to you. I don't want to put so much of yarn on accommodation here because everything comes at a time cap. I hope you guys got it. Fantastic. This, I would say, is what we can call to be the end of bills of exchange, but beginning of promissory note. Promissory note, there's not much to know. All you have to remember is bills of exchange is an unconditional order. Promissory note is a promise. You are seller, I am buyer. You sell goods to me, you make an unconditional order on me and I accept bill of exchange. But I will tell you, who are you to order? Why should I sign the bill that you drew? No, you keep your ego with you. I have my ego with me. Then what will I do? I'm like, you don't order me. I will only make a promise. Instead of you raising one bill, writing unconditional order and me signing, I will only prepare a bill saying that I promise to pay you 10,000 rupees after 3 months. And I will write signature. I will put date. I will give it to you. Same, yeah. When you say bills receivable in the balance sheet asset side, it is bill of exchange, it is promissory note together. When I say bills payable in my balance sheet liability side, it is bill of exchange or promissory note. Same. But bills of exchange is a negotiable instrument. Bills of exchange is a promissory note is not. The reason is in our country, currency note is a promissory note. If you see 10 rupees note, they've written, I promise to pay the bearer of this note 10 rupees or equivalent. So RBI issues it like a promissory note. So it's bearer note. If you have 10,000 rupees, 10 rupees in your pocket, that's yours. You give the 10 rupees to me, it's mine. Whoever holds it, it belongs to them. So promissory note in our country should be directed to a specific person. You should write the name of the person to whom it belongs. If you write the name, it belongs to that person. Is it not negotiable at all? No, possible. But it's not a bearer instrument. It is not a meaning I write your name and give it to you. It belongs to you. Unless you specifically negotiate it to somebody by writing their name. You put your signature. Then it can be transferred to somebody. But by default, it is a bearer. It is not a in our country, can you give a bearer's promissory note? No. It has to be specifically directed to a person. By default, it is not a negotiable instrument, but you can specifically direct it to somebody by signing later. You get this? Small conflict there comes in accounts and law. In accounts, you end up reading it's a not a bearer instrument and stops there. In law, you read it in depth. What you read in law is complete learning. What you read in account is only part of it. Don't get confused with this. Like accounts law yav tappu enu gottagta illa, education system is bad. Why should I read? I am God, God is great. Don't take such big conclusions. You need to remember how to read two things simultaneously and come to one conclusion. So this is the understanding with regard to promissory note. There is no confusion, full clarity. Yeah, don't get confused at that point. I hope you guys understood. That calls for end of bills of exchange. Let's now start with final accounts of sole proprietor. In this chapter, we're trying to prepare final accounts of a sole proprietor with what objective? With an objective of providing sufficient information for the purpose of decision making. When we did chapter 1 revision, we understood no they for the purpose of decision making, accounting information is crucial, and the characteristics or the usefulness of the accounting information is it will help us analyze the financial performance, financial position, liquidity position, solvency position, using which the decision can be taken. So that summarizing stage, whatever we discussed in chapter 1 or whatever we gave reference to in chapter 2 is fulfilled by final accounts that we prepared for sole proprietor here. There are two things that we were trying to do. One, evaluate financial performance. Two, evaluate financial position for the purpose of decision making. So what does final accounts include? It will include manufacturing account, it will include trading account, it will include P&L account, but there is no concept of P&L appropriation and cash flow statement. We will do manufacturing, trading, P&L and balance sheet. Then we'll ask ourselves a question. Every entity, is it supposed to prepare manufacturing and trading, or is it manufacturing or trading? The answer is very simple. You need to ask, are you a manufacturer or are you a trader? If you are a manufacturer who doesn't sell what you buy plastic, you make water bottle and then sell. Manufacturer. You buy water bottle, you sell water bottle. Trader. The one who buys plastic, makes the water bottle and sells the water bottle is manufacturer. The one who buys the water bottle and sells the water bottle is trader. So a manufacturer will have three variants of inventory in his accounts. WIP, raw material, and then finished goods. If you are a trader, you have only one variant of inventory, finished goods. So manufacturing account is prepared if you are a manufacturer. If you are a trader, you will not prepare manufacturing account. Who prepares manufacturing account? Only a manufacturer. Does a trader prepare a manufacturing account? No. What is the objective with which manufacturing account is prepared? It is with an objective of determining the cost of production. The next point that I want you to note is with regard to trading account. Trading account will be prepared by trader. Trading account is also prepared by manufacturer. If you say, sir, manufacturer, if he prepares manufacturing account and doesn't prepare trading account, why does trader prepare trading account and manufacturer also prepares trading account? Very simple. Everybody is a trader. Manufacturer is a manufacturer and trader. Trader is only a trader. Trade means what? Buying and selling. Now, whether you manufacture or you buy, you have to sell. If you don't sell, why do you manufacture goods? So you are a seller for sure. So you have to prepare trading account. If you buy and sell, only trading account. If you manufacture and sell, manufacturing account and trading account. So the answer is, if you are a manufacturer, what do you prepare? Manufacturing account and trading account. If you are a trader, you prepare only trading account. What is the objective of preparing manufacturing account? Not to find profit. It is with an objective of determining cost of production. Objective of determining finished goods what you produce. How much is the cost incurred to manufacture? Why do you want to find this? Once you identify the cost incurred to manufacture, to this cost you will add profit. You will add profit. To the cost of production, if you add profit, it will become selling price. To the cost of production, if you add the desired profit margin, it will become selling price. If customer comes to you and then asks for a product, you are about to give, you should tell one price. How do you decide that price? The price is set based on the cost that you incurred plus the profit that you are expecting to earn, or the profit that you are intending to earn. So the cost incurred plus the desired profit is equal to selling price to the customer. I hope you got it. Say something. Fantastic. Talking about P&L account. The objective of P&L account is to determine net profit. The objective of trading account is to determine gross profit. And balance sheet is to understand the financial position. When do we prepare final accounts? We've answered this several times. In accounting process, accounting cycle also we've answered this. When do we prepare final accounts? At the end of the year you will do, but it need not be only at the end of the year. Can you prepare final accounts every quarter? Yes. Can you prepare final accounts every month? Yes. Can you prepare it every week? Yes. Can you prepare it every 6 months? Yeah, your choice. Whenever you want to know the financial performance, whenever you want to know the financial position, you can prepare final accounts. And how to prepare final accounts, that's what we're going to learn in this chapter. Answer this question: is it manufacturing or trading, or is it manufacturing and trading? Depends. If you are a manufacturer, you prepare manufacturing and trading. If you are a trader, you only prepare trading. Okay? How many variants of raw material did I talk about? Three. What are they? One, raw material. Two, work in progress. Three, finished goods. Where do we write which item? In manufacturing account, we will write raw material, work in progress, and finished goods. See, in manufacturing account, you write raw material, you write work in progress as well as finished goods. However, in trading account, you write only finished goods. In trading account, you write only, I'll repeat, in manufacturing account, you will write raw material, work in progress, and finished goods. However, in trading account, you will write only, in trading account, there is no place for raw material and work in progress. And in balance sheet, you will write everything because everything is asset. It doesn't matter. Is it raw material, is it work in progress, or is it finished goods? Every form of inventory is your asset. Everything will be written in balance sheet. I hope you got it. With regard to manufacturing account, I want you to have a simple image in your mind. If you have this image, you'll be able to do manufacturing account with peace. Manufacturing account is like a factory. Manufacturing account is like a, the moment you go to the factory, you open the door, what do you see? You see materials which are half finished. Let's take our example that we used in inventory. You're taking cotton, making thread, making cloth, making shirt. What is your raw material? Cotton. What is your work in progress? Cloth. What is your finished goods? Shirt. The moment you go to the factory, what do you see? Cloth. What do you see? WIP, work in progress. So the moment you open manufacturing account, debit side, you would write opening work in progress. What do you write debit side? Credit side, just before you leave, again you see cloth only. So debit side you will write opening work in progress, credit side you write closing work in progress. How did the cloth come? Cloth did not come. Cloth was made. How did you make the cloth? Cotton was first woven into thread. Thread was weaved into cloth. Cloth was cut, put together and stitched into shirt. You got it? So what do they take? They take cotton. For cotton, there is some cotton which is already there in the factory, some cotton which was purchased, some cotton still left. So cotton is considered as an expense in making the shirt only when it is consumed. You bought 100 kgs of cotton, not used, kept just like that. Is it expense? No, it is asset. When is it expense? 100 kgs of cotton purchased is converted into thread, woven into cloth, made into shirt, then expense. So what to do? With regard to raw material, we would have to write consumption of raw material as expense. What do we write? Consumption of raw material as, usually you have the tendency of writing opening on the debit, closing on the credit, purchase on the debit. No, same we were doing opening plus purchase minus closing. It's all done in only one place and we call it consumption of raw material. What do we call it? Consumption of raw material. How do we find consumption of raw material? Opening raw material plus purchase of raw material minus closing raw material. Once again, opening raw material plus purchase of raw material minus closing raw material. Once you do this, you'll get what? Consumption of what? What do we get? Consumption of, it's like this. Morning when you left home, you had 10 chocolates in your pocket. How many chocolates were there in the pocket in the morning? On the way to the academy, you bought 20 chocolates. On the way to the academy, how many did you buy? 20. How many was there in the pocket in the morning? 10. How many did you buy? Together, how many should be there in your pocket? Together, 30 should be there. Everybody understood that 30 should be there. You have only 5 in your pocket. How many? 25. How? Opening 10 plus 20 purchased, 30. Minus 5 is there. Balance 25 consume. Same thing. Opening raw material 10,000 kgs. Raw material purchased 20,000 kgs. Closing should be 30,000 kgs. But closing is only 5,000 kgs. Consumed is 25,000 kgs. I hope you understood how to compute consumption of raw material. And if you keep all the raw material, take one magical wand and then say Pitrudev Sadrakshanam. Ingaudium Leviosa, will it become finished goods? No, effort has to be put. Don't you think so? We have to hire one tailor, we have to hire one weaver, we have to buy some dye, dip it, stitch it, cut it, everything together, then it will become shirt. All of that will happen at a cost. That cost is called as manufacturing expense. ಸಿಗ್ಲಿಲ್ವಾ ಅಣ್ಣ? ಬ್ಯಾಗ್ ಅಲ್ಲಿ ಇದೆ ಅನ್ಸುತ್ತೆ ನೋಡಿ ಒಂದ್ಸತಿ. ಭರತ್ ಕೇಳಿ ಇಲ್ಲ ಅಂದ್ರೆ ಬ್ಯಾಗ್ ಅಲ್ಲಿ ಇದೆಯಾ ನೋಡಿ, ಇಲ್ಲಾಂದ್ರೆ ಭರತ್ ಕೇಳಿ. So manufacturing expense. Manufacturing expense is everything. Rent of the factory, depreciation on the machinery, labor wages paid or salaries paid to the workers, electricity for the machine, everything together will become manufacturing expense. You put raw material, You put labor and expenses, it will become finished goods. What will you do with the finished goods? It will be sent to trading account. It will be sent to warehouse or showroom. So in manufacturing account, I'll write by trading account. What will write in manufacturing account? In trading account debit side, you usually write opening stock purchase, no? Instead of writing purchase, we'll write manufacturing. If you are not a manufacturer, you buy inventory from somebody. If you are a manufacturer, you don't buy. Whatever you manufactured in manufacturing account will get shifted from manufacturing account to trading account. Will get shifted from manufacturing account to, I hope you understood. So what is the format of manufacturing account? Debit side, opening WIP. Credit side, closing WIP. After that opening WIP, what do we write? Consumption of raw material. How do we find? Opening plus purchase minus opening plus purchase minus closing. And manufacturing expense also will be written. Credit side, finished goods, what is manufactured will be transferred to trading account. Some items will not become finished goods. Scrap, what to do? That will be sold, that will be written here as sale of scrap. To the extent it is manufactured and it is good to consume, it will be transferred to trading. Some items are scrap, it doesn't become finished goods. That will be sold here only. That will reduce the cost of production. I hope you understood manufacturing account. If they ask with manufacturing, you have to do manufacturing, trading, P&L and balance sheet. If they don't ask for manufacturing concern, you straight away do trading, P&L, balance sheet. Quickly tell me what is the objective of doing manufacturing account? Cost of production. Fantastic. Then we'll do trading account. What is the objective of trading account? Gross profit. What is the objective of trading account? How many variants of inventory will we have? 3. Raw material, work in progress, finished goods. How many variants of inventory will be written in manufacturing account? All 3. Raw material, work in progress, finished goods. However, in trading account, you will write only finished goods. Only trading account is like showroom. In showroom, will you keep raw material? No, only finished goods. This is your favorite format. You will start with opening stock on the debit, purchase on the debit, sales and closing stock on the credit, GPS balancing figure. If there is any direct expenses, you write it here. And if it is a manufacturing entity, instead of writing purchases, what would you write? Manufacturing account. When you write purchases, always remember to write it purchase less return. When you write sales, always remember to write sales less return. Sir, can I write sales here and can I write sales return here? That might have been working in your PU. But here, what if they give gross profit as a percentage of sales? If you write sales on the credit side, sales return on the debit side, then you apply GP as a percentage on this sales. That GP will be wrong. Because GP is wrong, closing stock, which is later found as balancing figure, will also be wrong. So there are several things that can go wrong in your answer. So how to ensure that the answer doesn't go wrong? Very simple. Always write sales less return. Always write purchase less return. I hope you understood. Say something. So what all will you write in your trading account? Opening stock, closing stock, purchases or manufacturing account, direct expense, and then sales less return. We'll find GP as balancing figure. And if I write all of these items on one side of the equation, all of these items on the other side of the equation, they should match. So can I say opening stock plus purchase plus direct expense plus gross profit is equal to sales plus closing stock?
Yes, sir.
In that case, if I send this profit on the other side, bring closing stock on this side, it will become opening stock plus purchase plus direct expense minus closing stock, which is COGS. Sales minus gross profit, which is again COGS. So there are two ways in which COGS can be found. How do we find COGS? Opening stock plus purchases plus direct expenses minus closing stock. Another way, sales minus gross profit. Both ways you get what? Cost of goods sold. Cost of goods sold. Very nice. Then the next thing that I would want you to note when we talk about this is P&L. So the objective of manufacturing, finding cost of production. Objective of trading account, to find gross profit. Objective of P&L account, to find net profit. What is the objective of P&L account?
Profit.
When we're trying to find net profit, in the P&L account, debit side I write expenses. Debit side I write, credit side I write income. Debit side, expense. Credit side, expense, income, difference, profit. Expense and income, difference will be if in case the income is more than expense. If income is more than expense, profit. If the expense is more than income, loss. All the indirect expenses and indirect incomes will be written here. Now we have a very interesting question to discuss. Where will you write depreciation? Is it, see, expenses will come in manufacturing, expenses will come in trading, and expense will also come in P&L. Expense will come in manufacturing, expense will come in trading, expenses will also come in P&L. ಲಿತಣ ಬ್ಯಾಟ್ರಿ ಆಗಲಿತ್ತಾ ಸಾರಿ ಥ್ಯಾಂಕ್ಸ್ ಅಣ್ಣ ಸೌಂಡ್ ಬಂತಾ ಮೈಕಲ್ಲಿ ಬಂತು ಕೇಸ್ ಆಗ್ತಾ ಇದೆ so we have expenses in manufacturing account, expenses in trading account, and expenses in P&L account. My question to all of you is, which expense will you write where? Is the question that we're trying to learn. If there is depreciation as expense, where do you write? Do you write it in manufacturing account? Do you write it in trading account? Or do you write it in P&L account? Very good. How many of us say P&L account? That's not such a straightforward answer. If the depreciation is on the machinery which is used in the factory for production, such depreciation will go to manufacturing account. If the depreciation is on the building which is used in the godown, actually you can write it in trading. If it is everything else, you can write it in P&L. So treat it like three different places. One, factory. Two, showroom where the goods are sold. Three, office. Office expenditure, P&L account. Factory expenditure, manufacturing account. Showroom expenditure, trading account. Are you getting it? Akka? Very good. Lighting, depends. If it is factory lighting, manufacturing. If it is lighting in the office, P&L. P&L. Are you getting the difference here? Then wages. Depends. If it is manufacturing wages, manufacturing account. If it is wages paid in the office, P&L account. Are you getting it? Sometimes you end up writing it in trading account. Wages. Why? The reason is very simple. It should go to manufacturing, but we are not preparing manufacturing. Sometimes, no, what they do is they buy water bottle like this. They buy water bottle like this. They sell water bottle, they buy water bottle. Manufacturer, trader. I buy flask. Okay, what not water? Flask. I buy flask. I sell flask. Manufacturer or trader. But on this flask, what is written? Milton. What do I put? I'll put your name and sell. I'll put your company logo and then give it to you. Is that manufacturing process? No. Without that logo also, this is what do you call this? Flask. With that logo also, this is flask. That logo has no impact on what's inside. If you put the logo and then put water inside, will it become milk? No, that has no change. You get this? Logo on the flask has no impact on the content inside. But still, they incur wages for it. No, it is not manufacturing process, but it is still bringing it to saleable condition. That wages will be written in our trading account debit side. I hope you're able to understand the classification between items. Say something. Yeah, where do we write salaries? P&L. Where do we write wages? Manufacturing. What if they give wages and salary? We need to split and write wages in manufacturing, salaries in P&L. Are you getting it? If they don't give, then we'll think wages might be more and we'll write in trading. It's not like wages and salary means trading account, salary and wages mean P&L account. No, it's not like that. First is it's not like that. We have to always split wages and salary and then treat. If they don't give us the split, we will assume that wages are more than salary, so write in manufacturing, or salary is more than wages and then write it in P&L. That should be our assumption. I hope you got it. Yeah, there are some items that you should be cautious about in your P&L, that is expenses and incomes. So expense and income, when it is written in P&L, it should be written on what basis? Accrual basis or cash basis? What do you mean by accrual basis? When it is occurred, not the respective of cancel. Expense should be recorded when it is incurred, not when it is paid. Expense should be recorded when it is, not when it is. During the year, I paid 11 months rent to my employee. 11 months salary to my employee. I did not pay 1 month salary. I'm paying it next year. In my PL, I should still write 12 months salary, though I paid only 11. Why? 12 months salary is accrued, but paid is only 11. 1 month salary is outstanding expense, but it's still expense. So remember, expenses have to be recorded on accrual basis. Incomes also have to be recorded on accrual basis. Basically, prepaid expenses, outstanding expenses, treatment you should know. What do you mean by prepaid expenses? Money paid, benefit not taken. What is prepaid expense? Money paid, benefit. What is outstanding expenses? Money not paid, benefit already taken. Prepaid expenses, asset. Outstanding expenses, you understand? So if I paid 10,000, if that includes prepaid expense of 1,000, what should I do? Only 9,000 is my expense. 1,000 is next year's expense. Paid now, it will become asset. It will become, what if I paid 10,000 and 1,000 rupees is outstanding expense? I have paid 10. I am yet to pay 1. Together 11 is my expense. Together 11 is my, are you getting it? Yeah, help me with this. Expense is 10, paid is 10. Expense is equal to payment. There is no outstanding, there is no prepaid. What if expense is 10 and payment is 12? You paid more. That extra that you paid is prepaid. If expense is 10 and you pay only 9, to the extent you don't pay is outstanding. This outstanding expense is liability. Outstanding expense is yeah, yeah. It is liability. And prepaid expense is, I hope you understood this. Same with regard to income also. Income also should be recognized when it is earned. What is pre-received income? Money is received, but income is not yet earned. Money is received, but income is not yet. What is accrued income? Money is not yet received, but it is already earned. Money is not yet received, but it is already earned. And pre-received income is liability. And accrued income is asset. Let's see it with the help of an example. If income is 10,000, but you receive 10,000, whatever is your income you received, no asset, no liability. No pre-received, no accrued. How about income is 10, but you received 12, you received more. Pre-received income, liability. This will be liability. And what about accrued income, earned but not received? Asset. I hope you understood this. Pakka? Then some adjustments can come in your questions in PL based on managerial remuneration. Based on managerial, if they tell profit of the entity is 1 lakh, you computed it after rating income minus expense. Opening stock purchases, sales, closing stock, GPU found, GPU brought it to PL, you wrote all the expense, you wrote all the income, you wrote income minus expense and you found net profit. How much is net profit? 1 lakh. Sales manager is entitled to commission of 10% on profit before charging basis. How much is the commission that we should pay to sales manager? 1 lakh into 10 divided by 100. 1 lakh into 10 divided by how much we get? 10,000. That's the answer. Commission. Because they use the word before. What if they use the word after in the question? Then you would have to do 1 lakh into 10 divided by 100 plus 10. You do 1 lakh into 10 divided by 100 plus 10. That's what you should do. Because if the profit before commission is 110, if the commission paid is 10, then profit after commission is 100. Did not understand this? We'll do it slightly slower. Observe. And I'll do this also. Help me. What does the question say? How much is profit? 1 lakh. How much is commission? 10% on what? Profit before charging commission. So we have profit before commission. We have commission. We have profit after commission. How much is commission? 10% on what? 1 lakh. On profit before commission. So can I say this is 100? Profit before commission is 100. On the 10% commission you should pay. If 100 is your profit, in the 10 if you give commission, closing will be how much? Very good. How did we get 90? 100 is the profit before commission. 100 is the profit before commission is 10. From 100 you deduct 10. What do we get? From 100 you deduct 10. What do we get? Come to the next case. In the sorry, now profit they have given how much? 1 lakh. Now cross multiply 1 lakh into 90 by 100. Profit after commission. Or you want to know commission? 1 lakh into 10 by 100. 10,000. 1 lakh into 90 by 100. 90,000. Is that okay? Does this make sense? In the second case, what are they told? 10% on profit after charging such commission. Commission is 10. Commission is 10. On what? Profit before or profit after? Profit after. So this is 100. Profit after commission is 100. Profit is don't know. Before commission, we don't know. See, there is some profit. After paying 10 rupees commission, it is 100. So how much is it before? 110. And this is 1 lakh. Now you do 1 lakh into 10 by 110. 9,091. Did you understand what do you mean by before and after? Did you get the concept of before and after? I'm not getting response. What do you mean when you say before charging? On the profit they've given, straight away apply 10 by 100. If they say after, this is 10. This is 100. So the profit before will be 110. And then you cross multiply, you will get it. Don't apply some dumb logic of into x by 100 plus x. No, it's a shortcut, but that's only a shortcut. Accounts is not a MCQ exam. You need to have logic here. Cool. Then we have an irritating question that we do based on simultaneous linear equation part. Not worth discussing a marathon. Let's quickly move forward to the next concept. So now you understood the overall part of it. P&L appropriation anyways not needed. Then a quick overview of balance sheet. Balance sheet is prepared on a specific date. You write the value of the asset in the balance sheet, you write the value of the liability, you find the capital position of the entity. Balance sheet can be prepared vertically, can be prepared horizontally. For corporate entities, format given by Schedule 3 of Companies Act requires them to prepare it vertically. For a non-corporate entity, can you prepare horizontally? Yes. You can write liabilities followed by assets. That is horizontal, allowed. But who has to prepare it under vertical method? Corporates. Understood? Because Companies Act is applicable. The order of writing the items in the balance sheet is called as marshalling. What is it called? Marshalling. Order of writing the items in the balance sheet is called marshalling. Marshalling. There are two orders. One, order of permanence. Two, order of liquidity. One, order of permanence. Two, order of liquidity. In the order of permanence, we write the fixed assets first and then we write the current assets. In order of liquidity, we write current assets first, then write fixed assets. Who follows order of liquidity? Banks and financial institutions follow order of liquidity. But what do? We'll always write fixed assets on the top, current assets at the bottom. We always write capital and non-current liabilities at the top, current liabilities at the bottom. I hope you got it. Say something. You know the balance sheet format now? How do we classify an item as current and non-current? I hope you know it. Operating cycle. Is the basis? If an item fits within the operating cycle or subject to minimum of 12 months, current. If not, non-current. So this is basic overview of entire final accounts of sole proprietorship. And you have to deal with sundry debtors and family in detail. So this I will give another separate video on sundry debtors and family. Basically, I'll give you an overview now, but in detail, it's there as a separate part. I'll anyways put an iCard here, or I'll tell you people, or ask me in the comments, then I'll tell it for people who are watching it recorded. You can watch it as a separate detailed discussion. In short, if I have to tell, debtor is an asset, bad debt is an expense. Debtor is an bad debt is an bad debt is when one customer who has to pay you money says that he will not pay money. I have a question to you. Why is bad debt an expense? Why? It is a very simple reason. Allah. You sold goods to that customer. When you sold goods to that customer, you are supposed to recover money from that customer. You recorded sales. Because you recorded sales, GP has come. Am I right? But has he given you money? If he gives you money, profit is realized in cash. If he doesn't give you money, profit is not realized in cash. So the sales what you booked earlier, because of which you're booking income, now you're reversing it. You're not just reversing the profit on that sale, you are reversing the entire sales by the name bad debt. I sold you goods worth 80 at rupees 100, 20 rupees profit I'll make. In my trading account, debit side I write purchases 80. Credit side I write sales 100. 100 rupees worth of goods I've sold to you. What did I purchase at? 80. At what rate did I sell it to you? If I buy it at 100 and write 80 debit side, credit side I write 100. GP will become 20. But you did not pay me 100 rupees. You did not pay me. If you did not pay me 100, can I say it is like I gave you 80 rupees worth of goods free? When I gave you 80 rupees worth of goods free, do I make profit or loss? How much? 80 loss. No. So you got GP as 20. You get GP as 20. Why? Purchase is 80. Sales is 100. GP is 20. GP 20 you bring to P&L. Right? Bad debt 100. Net profit will become minus 80 or loss. So you book bad debt because sales whatever you recorded is no longer like sales. Is he returning the goods to you? He doesn't return the goods and he doesn't pay the money also. So seller, you are the seller. You have sold goods. You have booked sales income. Because the customer doesn't pay money, that entire sales income should be reversed. And that reversal of sales income, no reversal of inventory is called as bad debt. Are you able to relate to it? Should I write the numbers and then explain? No, sir. Pakka? Sir. Good. So, Sunday debtors is an asset. We are supposed to receive money from them. Asset side. Bad debts is expense because the debtor won't pay. We will write it in P&L account debit side. Provision for bad debt is expected expense. The customer is not told that he will not pay. You believe that he will not pay. As the customer told he will not pay, what do you feel? He will not pay. So what do? Conservative approach. Conservative approach. We book expense. We book expense, but we won't deduct our debtors. We don't deduct our. What is the journal entry for provision for bad debts? Provision for bad debt account debit to? Wrong answer. In provision for bad debt entry, never will ever debtors come. Provision for bad debt entry ಅಲ್ಲಿ debtors ಬರೋದಿಲ್ಲ. ಎಲ್ಲ ಮರ್ತೋಗಿದ್ದೀರಾ. Some of you have not read, some of you have skipped, some of you have forgotten. All of you are wrong. Unity is there in that. In provision for bad debt entry, there is no debtors. Provision is an expense. You debit P&L. Provision is an expense. You debit P&L. And you create provision. Provision is a liability once you create it. You credit provision. Journal entry for provision is P&L account debit to provision. What is journal entry for provision? P&L account debit to. In P&L account debit side, will write to provision for bad debts. And this provision should be written in the balance sheet on the liability side. It should be written in the balance sheet on the. If in case there is a liability against which the asset is there, instead of showing the liability on the liability side, we deduct it from asset. So actually provision is a liability. Actually provision is a expected the debtor to not pay. So what do? What is the journal entry for bad debt? Sir, what is the journal entry for bad debt? Bad debt to debtor. Sorry, what is the journal entry to provision? P&L to provision. P&L account debit because it is expense. Provision account credit because it is liability. This provision should be shown in the balance sheet on the liability side. I'll show it to you. Wait. Provision should be shown in the balance sheet on the liability side like this. It should be shown on the liability side. But this provision is created on this debtor only. As a matter of disclosure, I'll shift this provision from the liability side to asset side and deduct it from my debtors. That's only as a matter of presentation. In the regular class, we've done so many cases, 6-7 cases in one AQ. Before that, one AQ. And then after this, we've done third AQ, one more. We've done so many. If you people have forgotten, then it's a terrible, terrible mistake. I'll anyways share the link of that in this part. You please watch that provision and bad debt part. Provision and bad debt part is very crucial. If you don't get this sorted, no, your final accounts problems will go wrong. Your expense will go wrong. Your net profit will go wrong. Balance sheet debtors will go wrong. Basically, final accounts question damar. Doesn't stop there. You come to CA intermediate. When you do financial statements of company, schedule 3 format, again bad debt, provision for bad debt, provision for discount, what to say, bad debts recovered, everything will come. So this is something that you cannot skip, something that you cannot wrongly learn or wrongly understand. I hope you'll put in little effort today to finish that part. Make some noise. Okay, then we also have something called as bad debt recovered. Bad debt recovered. What is bad debt recovered? Previously, you wrote off something as bad debt. Now that person realized and he started giving you money. Earlier, what did you do? You wrote it off as bad debt. Now you're able to recover the money. If in case you recover the money now, it's an income. It's an income. Don't look at the board. Try and guess what is the journal entry for bad debts recovered. You guys are so easy to go wrong. Okay. If I tell you what is the journal entry for bad debts recovered, say bad debts recovered account debit. Whatever I did, straight away use that only as debit. What is the entry? Bank account debit to bad debt recovered. Bad debt recovered is income, credit. When you say bad debt is recovered, you collect cash, debit cash. Bank account debit to bad debt recovered is the entry. That bad debt recovered is income, transfer it to PL. What is the entry to transfer it to PL? Bad debt recovered account debit to PL. Bad debt recovered account debit to. What is the entry when you collect the money? Bad debt recovered. Bank to bad debt recovered. What is the entry to transfer it to P&L? Bad debt recovered to P&L. Basically, bad debt recovered has no impact on provision, has no impact on bad debt, has no impact on debtors. It will not affect any of those items. Don't try to adjust them. P&L account credit side, you write bad debt recovered income, and in your cash book, add bad debts. The bad debt recovered money has increase in cash balance. This is the adjustments with regard to bad debt recovered, and provision that you should know. Note this point, and then let's proceed to what do we have after that? Then that's it. Yeah, several other beautiful adjustments they'll give. Read the trial balance, understand what's happening, and then post. They might interconnectedly give some items. They might give sales in one question and then tell GP is 20%. On sales, you apply GP 20%. Sometimes they'll tell GP amount they'll give and GP percentage they'll give. Using GP percentage and GP amount, can you find sales? Yeah. If they give 100, on the 20% is 20. If they give 20 and then tell GP is 20%, 20 into 100 by 20 will give you sales. If they give GP, can you find sales? If they give sales, can you find GP? Sometimes they'll give GP percentage, not on sales, but on cost. Will you be able to handle such scenario? How do you handle such scenario? Very simple. How do you convert? If they give GP percentage on cost, remember 1 by X on cost is equal to ಇದೇ ಲಾಜಿಕ್ ಹಾಕೋದಲ್ಲ 1 by X minus 1 ಹಾಕ್ತೀರಾ. Wow. One second. I will show you one small part on this. What is the formula for sales? Sales is equal to cost plus. Very good, very good. Once again, tell me, sales is equal to cost plus cost minus profit plus profit alvenry. Sales is equal to cost plus. Really, you have doubt in this? No, sir. Pakka? Sales is equal to cost plus profit. Okay. Imagine cost is 100. Cost is 100. Sales is 200. Profit is 100. Cost is 100, no? Sales is 100. If your selling price is 100 when the cost is 100, how much profit did you make? How much is profit percentage? You cannot tell so easily. Profit percentage means what? Profit percent on what? It can be on cost. It can be on sale. If someone asks how much is profit percentage, you should ask profit percentage on what? Profit can be computed as a percentage on cost. Profit can be computed as a percentage on sale. You are sitting on bench. Your book is on desk. Calculator is on book. Water bottle is on desk. So you can sit on the desk, you can sit on the bench. Is there a difference? Yes or no? So that your profit depends where are you sitting. Are you sitting on cost or are you sitting on sales? That's how we find percentage. If you say 50%, I'll say it's 100%. If you say 100%, I'll say 50%. What is 50? What is 100? When is it 50%? When is it 100%? Depends upon what we compute. Profit percentage can be computed on cost. How do we compute profit percentage on cost? Profit is sitting on cost. Numerator will be profit. Denominator will be cost. 100 by 100. How much will you get? 1. 100 by 100 is 100. 100 by 100. 1. Multiply by 100. 100%. What is the profit margin? On cost. What if I do profit percentage on sales? Numerator is profit. Denominator is denominator sales. Profit 100, sales 200. 100 by 200. 1 by 2, 0.5 multiply by 100. 50%. So 100% profit on cost is 50% on sales. Are you getting it? What if this is the data? What do we do? Cost is how much? Sales is how much? How much is profit? You tell me how much is the profit on cost? Profit is 50. Cost is 100. 50 by 100. 1 by 2, which is 50%. What is profit on sales? 50 by 150. 1 by 3. 33.33. Are you getting it? Pakka? Now, if I give you profit as 25, profit as, and I'll give you on sales, it is 125. It is 25 by 125. 20 by 125. It's quite easy to do here. Here I'll do on sale, it is 25 by 125, 1 by 5, 20%. How do I find on cost? See, sales is 125, profit is 25. How much will be cost? 125 minus 125 minus 25. How much will be cost? So profit on cost. Can I say it will be profit divided by cost? 25 by 100. Are you getting it? So basically, you're doing 1 by x, 1 by x plus 1. No. What is this X and what is this plus 1? What you are doing is profit divided by cost. This is profit percentage on cost is profit by cost. How do we find profit percentage on sale? Profit by, okay, interesting. Profit by sale. You don't know how much is sales. So can I write profit by sales as profit by cost plus profit? What is cost plus profit? What is cost plus profit? And this profit, you are calling it 1. This cost, you are calling it X. And here, you are rating it as 1. And you are rating this as profit is 1. Who told you always the cost will be 100? If it is not 100, what do you do? So the simple logic is it's not 1 by x, 1 by x plus 1. It's not 1 by x, 1 by x plus 1. What is it? It is profit by cost plus profit. If I give you profit by sale, how do you compute profit by cost? Profit by sale minus profit. So don't do x plus 1, x minus 1. Logic. It's not mathematics. X, O, Y, Z, do right? A, B, C, D, L, what should you do? Profit by cost. And profit by cost plus profit. Do you get the logic? Yes. Finish. Help me with the last one. Here, I will tell you that profit is 20. I will reveal cost to you. 100. On cost, how much is the profit? 20 by 100. ನಾನು 20 ಹೇಳಿದಾಗ ನೀವು 100 ಹೇಳ್ಬೇಕಲ್ವಾ 20 by 1 by 5. How much is it on sale? 20 by 120, which is 100 plus 20. It is 100 plus. Sir, no sir, I like 1 by x and 1 by x plus 1. Your 1 by x and 1 by x plus 1 has limited usability. If I tell profit is 50%, you will tell 1 by 2. Am I right? I'll tell you profit is 2/3. Profit on cost is 2 by 3. Yeah, 2 by 3 profit. Sir, 1 by x I know. In the numerator, if it is not 1, I don't know what to do. 2 by 3. You understood what I'm trying to tell? How much is profit? How much is profit? Yeah. Profit by cost ಹೇಳ್ತೀನಿ ನೋಡಿ. It is 2 by 3. You can't do 1 by x, 1 by x plus 1 here. 1 alla. So if I have to do it into profit by sales, very simple, yeah. ಅಷ್ಟೇ. Profit by cost plus profit. I'll do 3 plus 2 by 5. You understood the logic? Very nice. Thank you. I hope you understood. So if you want, you can take a note of this. Profit on cost, profit by cost. Profit on sale, profit by cost plus profit. That will give you profit on sale. I hope you got it. Someday, if it is not 1 by x, come on. So that's the reason I told you this logic. Then by this, we're done with almost all the questions. Sometimes they'll give rectification of errors also. Rectification of errors also in final accounts. Some sales return is included in purchase return. Sales is included in purchase return. Goods withdrawn for consumption is not recorded. Wages for installation of the asset has been wrongly included in wages. You need to remove from wages, add it to the asset. So you have to be ready to do this rectification of errors. Whenever they give rectification of errors based final accounts question, don't do final accounts first. First to do rectification. Rectify the values first and then start with final accounts. Don't do it simultaneously. Finish rectification, then start with final accounts. Are you getting it? Sometimes they tell the amounts are connected. For example, if you see this question, bank overdraft is 80% of the real value of stock. And they told 80,000 is the 80% of the real value of stock. So then you have to just write that accounting equation and then find it. If you don't understand this to be done in this way, you can do it this way. This is a study material question. It's also there in our material. Your closing stock, if it is 100, if your closing stock is actually 100, bank is telling you they will give you overdraft. Bank is giving you how much? Overdraft. How much overdraft? They're telling 20% I will not agree to be the value. If you say your value of inventory is 10,000, I will tell, if you don't pay me money, if I take your inventory and then sell, I will not be able to realize 10,000. You might have purchased inventory at 10. Let's say I am bank. Who am I? You are the businessman. You took loan from me. How much loan can I give? I can give so much loan, so much I can recover from you. You are giving your stock as pledge. You're pledging your stock. Based on your stock, I'm allotting you bank overdraft. If you have stock of 100, you have stock of 100. Will I give you 100 rupees loan? No. You take 1 kg of gold. 1 kg is too much. You take some 10 grams of gold. Keep it in one pawn broker. Let's say each gram of gold is 10,000. Well, okay, take 12,000 into 10 grams. Take your calculator. Do it. 1 lakh 20. Do you think that pawn broker will give 1,20,000 rupees as loan? No, they will give less amount. Am I right? Same way, if you have 10,000 worth of inventory with you, will I give 10,000 loan? No. Will I give 10,000 loan? No. I'll deduct 20% as margin in this example. So if you have 10,000 loan, I will allow you to take loan on 800 or 8,000. If you have 10,000 rupees closing stock, 2,000 is margin. I'll only give you loan on the 8,000 worth of inventory. Are you getting it? On that 80% you've taken bank overdraft. So 100 rupees if it is the inventory, 20 rupees will be margin, which is 20%. Up to 80 is the value that I consider, real value of your inventory. On that 80% is your bank overdraft, which comes to 64. They will give 64, that is 80,000 to be the inventory. Sorry, 80,000 to be the bank overdraft. They would want you to find the closing stock. I'll repeat, if you have 100 rupees worth of inventory, banker will assume the value of the inventory to be 80. 20 rupees margin he will remove. How much is the real value of your inventory? What is the real value of your inventory? If you don't open your mouth, I won't go forward. What is the real value of your inventory? 1 lakh. 1 lakh. I'm showing you real value is there. 80 is there. How much? I'm asking how much is real value. I asked it 3 times. 2 times you're like judging. Third time I will like 1 lakh. You have inventory worth 100. Banker thinks 20 rupees he cannot recover. He will deduct margin of 20. What is the real value of stock? How much is the banker giving as a loan on the real value? 80%. 80% of 80. This is 80,000. If 64 rupees out of 100 is 80, how much is the value of the closing stock? 80,000 into 100 divided by 64, if you do, you will get 1,25,000. This is one of the questions in your study material. One of the unique adjustments. By this, I have given you some overview of final accounts of sole proprietor. Correct? Anything? Let's now start with chapter 8, financial statement for not-for-profit organization. See, not every entity, not every form of organization has the objective to make profit. Some of them start with a purpose. The purpose is to promote some form of art, culture, dance, music, or healthcare, or nutrition, education, and all of this. So that's how we start with not-for-profit organization. So they're not like anybody else. They are a club, they're a trust, they're a temple, they're a school, they're a charity organization, they're a library. So their objective is to serve the society, not to earn profit. They don't want to earn profit, but sometimes the money that they collect might be more than the money that they spend. Like for example, in your college, by mistake, if they charge slightly more fees than what they spend on you, that extra is not called as profit. That is called as surplus. They have no intention to charge extra. Your school, your college, hospital, all of these places, they want to charge exactly the same amount that they spend, exactly the same amount of service that is given to you. But sometimes by mistake, they'll charge some 200, 300% extra. That extra money, whatever is collected, is not profit, but instead it will be called as surplus. What will it be called as? But that's not the case. Lot of times, never it happens. If in case they've collected lesser than what is spent, it will be called not as loss, but it will be called as deficit. It will be called as, for example, they'll give you this much of education. They'll charge only this much fees. That extra education that they've given, spending extra cost, which they've not recovered from you, will not be loss, because you are investing in the future of the country by keeping the education in the hands of the right people. They are not wasting the money. It is not loss. It's an investment, and it will be called as deficit. And if you start a business, you have ownership. But when you start a not-for-profit organization, nobody has ownership. In business, you have capital. In NPO, it is called capital fund. What is it called as? It is not anyone's single owned money. So in a business, when you give money, it is called capital contribution done. Here it is donation given. Here it is. And now let's say there is one partnership firm. I spend 5 lakh rupees and invest it as a capital in the firm. In that firm, whatever assets are there belongs to me. In that firm, whatever profit is made, I can take. Similarly, if in case there is one library, to float that library, to create that library, I give 5 lakh rupees as donation. In that library, whatever assets are there, books, does it belong to me? No, I am not the owner. I did not give capital, I gave fund. And if in case from the library registration fees, if they've collected slightly extra money, is that profit? Can I take share in that? No, I am not partner. I am donor. I did not give capital. I gave donation. And that fund does not belong to me. That belongs to the fund. That belongs to the NPO. I hope you got it. Say something. So the result, if it is extra, it's called surplus. If it is less, it's called deficit. Never is it called profit or loss. I hope you understand. In a normal business entity, you prepare cash account, P&L account, balance sheet. Cash account, P&L account, balance sheet. The same cash account in an NPO is called as receipts and payment account. Same P&L account in an NPO is called as income and expenditure account. And balance sheet is called balance sheet. I'll repeat. In a business entity, you prepare cash account. What is it called as in NPO? Receipt and payment account. In what to say, normal business entity, you prepare P&L. What is it called in NPO? Income and expenditure account. And balance sheet is called as balance sheet. Balance sheet is called as balance sheet. There's no name to it separately. In this receipts and payment account, which is nothing but cash account, debit side will be called as receipt side, credit side will be called as payment side. Receipt side, debit side. Payment side, credit side is called as payment side. And in your income and expenditure, credit side, all the incomes used to write, that is income side. Debit side, all the expense used to write, that is called as expense side. We won't write debit credit, we'll write expense income. You won't write debit credit, we write receipt payment, and ultimately prepare balance sheet exactly the same way I used to prepare in the past. I hope you got it. Nice. So going further, we'll discuss in detail how to prepare receipts and payment account. Receipts and payment account, can you say it's nothing but cash book? Yes, sir. Very good. What is the nature of the account? It is like real account. You remember real account? Asset account. Debit what comes in, credit what goes out. You will record items in cash book or receipts and payment account on cash basis. If the cash comes, you record. If the cash goes, you record. If the cash doesn't come or doesn't go, you won't write the entry in receipts and payment. So when will you record a transaction in cash book, or when will you record a transaction receipts and payment account? If it affects cash. If it affects cash. The logic, the line to remember is like this. If it didn't jingle, it doesn't mingle. If jingles, if money is coming in or money is going out, write it in receipts and payment. What items are included? Goods sold, I'm going to say any service given and then cash collected, any item sold and cash collected, any expense paid, any asset purchased, any asset sold, everything will come in receipts and payment. What will not come? All non-cash transactions. For example, outstanding expenses, no entry. Depreciation, no entry. Bad debts, provision for bad debt, all of this will not be written in receipts and payment. I hope you got it. In your receipts and payment account, if there is a favorable balance, it is asset. Opening balance on the debit side, closing balance on the credit side. However, in the same receipts and payment account, if there is unfavorable balance, to explain in the terms that you understand, bank overdraft, then opening balance will be on the credit side, closing balance will be on the debit. So if opening balance is positive, which side do we write? Debit side. If closing balance is positive, where do we write? Credit. If there is overdraft, opening balance which side? Closing balance. Pakka. And what is the purpose of identifying or preparation of receipts and payment account? It is to help in preparation of income and expenditure and balance sheet. If expense is correctly paid, there is no balance. If the expense is different, payment is different, it will result either in prepaid or outstanding in balance sheet. Expense is 10,000, payment is 10,000. Is there a problem? No. No asset, no liability. Expense is 10,000, payment is 12,000. Prepaid 2,000 will go to balance sheet. So the item in expenditure side of the income and expenditure should match with the payment side of receipts and payment. Item in the expenditure side of income and expenditure should match with the payment side of receipts and payment. In your income and expense, you return 10,000 as expense. Payment has to be 10. If the payment is not 10, payment is 8, 2,000 will appear in balance sheet as liability. Are you getting it? Say something. If the expense is 10, payment is 11, 1,000 paid extra will appear in balance sheet as asset. So they're all connected. All three are connected. Usually all three are prepared simultaneously. But in your exam paper, what do? If they give receipts and payment, they'll ask you to prepare income and expenditure and balance sheet. If they give income and expenditure, they'll ask you to prepare receipts and payment and balance sheet. Very, very rarely they'll ask you to prepare all three. That will be a 20 marker. If they ask 14, 15, 16 or 12 or 10 marks, they'll give you one ledger, they'll ask you to prepare the other two. Do you get this? Quickly see this example. Subscription received. Will it appear in receipts and payment? How about salary paid? Donation received. Purchase of furniture for cash. Payment of rent. Sale of old asset. Interest received. Depreciation. Outstanding salary. Accrued income. Provision for doubtful debts. Loss on sale. Appreciation of asset. Credit purchase. Advance rent paid. Advance rent paid will come. It doesn't matter whether it relates to current year or not. Is it paid? It will be written in receipts and payment. In receipts and payment, we don't care whether it belongs to next year, current year, previous year. Is it paid or received? Receipts and payment. I hope you got it. Come on, let's go to the format. It will look like this. Receipt side is here, payment side is here. Opening balance on the debit, closing balance on the credit. Whatever is received is written on the debit, whatever is paid is written on the credit. We don't care whether it is capital or revenue. The moment it is paid, it is written. It can be income, it can be expense, it can be capital, it can be revenue, it can be relating to current year, it can be relating to next year. Is it affecting cash? Is the cash coming in or cash going out? If the answer is yes, write it in cash. If the cash is coming in or going out, what to do? Write it in cash. Receipts and payment. Cash book or receipts and payment. Are you guys getting it?
Yes, sir.
Very good. So quickly, let's see this one example. So this is the opening bank balance, 5,000. Where do I write? Debit side, receipt side. Am I right? Subscription received, donation received. Both of them will be receipt. Salary paid, rent paid will be credit. What is the cost of old equipment sold? 9. It is sold at a profit of 1,500. How much do I write? Receipt on sale of old furniture or old equipment. 9,000? No. Cost is 9. Profit is 1,500. How much is sale price? So I'll write 10,500. So opening balance 5,000, closing balance 24,500. That we had to find actually. Subscription received, donate received is receipt. Salary paid and ground rent paid is payment. And sale of old equipment cost 9,000, profit 1,500. Together 10,500 will become our receipts. I hope you got it. Say something. Similarly, you can do another question, but let's go to the next kind of questions. So next is income and expenditure account. You know, receipts and payment account is prepared on cash basis. If it is paid or if it is received, we write it in receipts and payment. Income and expenditure is prepared on accrual basis. What basis? It doesn't matter whether paid or not. It doesn't matter whether received or not. Does it belong to current year? If it belongs to current year, write it in income and expenditure. Rental expense 10,000, paid only 4,000. How much will you write in receipts and payment? 4. 4. How much will you write in income and expenditure? 10. Difference is there, no 6. Balance sheet. 4,000 paid, 10,000 expense, 6,000 not paid, liability in balance sheet. So it is the relationship between payment, receipts and payment and income and expenditure what results in balance. Are you getting it? What do you mean by balance sheet? Sheet where all the balances are written. Sheet where all the balances are written. Expense 10,000. Paid 6,000. How much is balance? 4,000 balance sheet. Expense is 10. Payment is 6. 4,000 is not yet paid. Liability side in the balance sheet. How about expense 10? Paid 12. 2,000 you paid extra, no? The 2,000 balance is balance sheet asset. So balance sheet is sheet where all the balances are written. And these balances will arise as difference between expense and payment or income and receipt. If you have interest income of 1000, how much should you receive? 1000. In the income and expenditure, if you write 1000 rupees as income, in the receipt side, how much should be there? 1000. What if you have only 800? 1000 rupees income. How much is received? How much is not received? 200 rupees is earned but not received. Accrued income, balance sheet asset. Getting it? That's the logic. So, what is the nature of income and expenditure account? You remember the rule of nominal? What is the rule of nominal? I want some response. People who are sleeping, wake up. What is the rule of nominal account? Debit all expenses and losses. Credit all. Very good. What is the basis? If it relates to current year, you record. If not, no. Includes only revenue items, even if it is non-cash. Will we write capital items? Only revenue items will be written in income and expenditure. Adjustment, prepaid expense, outstanding expense, accrued income, pre-received income. I hope you are aware. What is the ultimate result or objective of preparation of income and expenditure? To determine surplus or deficit, and ultimately purpose is also the same. Okay, for a quick check, help me. Subscriptions in the current year, will write it. Salary expenditure for the current year will be written. Depreciation, non-cash but still relates to current year, will be written. Rent outstanding, whether paid or not. Expense, no, write it here. Outstanding rent, will it appear in receipts and payment? No, it's not appearing there, but it's appearing here. Then prepaid insurance, no. Why? It is next year's insurance already paid. So that's one basic understanding. Let's read this one liner. If it belongs to the year, bring it here. If it doesn't belong to current year, don't bring it here. As sweet and simple as that. So revenue items, whether cash or not, revenue items, whether cash or not, will be written in receipts and payment. We ignore all capital items. We ignore non-cash items and capital items. We write all the cash non correct, no. We ignore capital items. Am I right? We write items whether they are paid or not if it relates to current year. Very good. So I've given one question. Let me take a short break. You guys try this. Try prepare income and expenditure. Little bit writing. When you prepared income and expenditure for this, no, you wrote the consultant fee received as income, salary paid as expense, medicine purchased as expense, rent paid as expense, donation received as income, interest received as income, depreciation on equipment as expense. Equipment purchased 30,000, capital expense. Would it come in your income and expenditure? No, it will be written in the balance sheet as an asset. On that equipment, if you compute depreciation of 3000, that would come here. When we discussed depreciation, I told the same thing. Expenditure, which is proportionate allocation of the asset over the useful life, is depreciation. You remember that? Very good. So this is the answer. You got 40? Fantastic. That's good to begin with. So this is one table which will help you understand the entire expense income portion. So you can keep this for later to see. Expense prepaid, paid but benefit not taken. Expense outstanding, benefit taken but not paid. Same thing we discussed in final accounts of sole proprietor. And prepaid is asset, opening balance debit, closing balance credit. Outstanding is liability, opening balance credit, closing balance debit. And income accrued means earned but not yet received, asset, opening balance debit, closing balance credit. Pre-received means received but not earned, liability, opening balance credit, closing balance debit. Let's do a quick check. If in case your expense, this we discussed there also, but we did not do there as a question, so that I can make you do it here. Help me with this. If expense is 10, payment is 10, it is both equal, no? Is it an asset or a liability? It is not an asset, not a liability. Who am I? No one. However, if your expense is 10, payment is 12, payment is more than expense. So you paid extra, prepaid expense, asset. What if your expense is 10, but you pay only 9? Whatever you don't pay will become liability, outstanding expense. Help me with income. Income is 10,000, receipt is 10,000. You received what you earned. Am I right? Is there an asset? No. Is there a liability? No. Who am I? No one. How about income being 10, receipt being 12? You collected extra, pre-received income. Pre-received income is liability. How about income being 10 and receiving only 9? Accrued income, income earned but not received. This will become your asset, accrued income. I hope you're getting it. Expense account, when you open it, would look somewhat like this. Prepaid expense is an asset, opening balance on the debit, closing balance on the credit. Outstanding expense is a liability, opening balance on the credit, closing balance on the debit. If there is any expense paid during the year, it will be written in the expense account on the debit side, to receipts and payment. And balancing figure will be expense for the year. In expense account, I have written by income and expenditure. In income and expenditure account on the debit side, it will be written as to expense. I'll repeat. Prepaid expense is an asset, opening balance debit, closing balance credit. Outstanding expense is a liability, opening balance credit, closing balance debit. Expense paid during the year. What is the entry? Expense account debit to receipts and payment. In expense account, I'll write to receipts and payment. In receipts and payment, on the credit side or the payment side, I'll write by expense. I'll find income and expense as balancing figure. If income and expense is given, I'll find receipts and payment as balancing figure. A small hack for all of you to remember. Don't do plus minus in your expenses, incomes, adjustments in NPO. Open ledger. Once you open ledger, every ledger, think outstanding, prepaid, expense, income, right, opening debit, closing credit, all that you finish. If they give receipts and payment will be available. After you write all the adjustments, come to the ledger and see. If opening, closing, receipts and payment is available, income and expenditure is balancing figure. If opening, closing, income and expenditure is available, receipts and payment is balancing figure. Every ledger will have 4 items: opening, closing, receipts and payment, income and expenditure. You would always know 3, you would not know 1. That missing 1 is balancing figure. And write it here and write it to respective receipts and payment or income and expense. I hope you got it. That's the A's that you should know for your expense. Similarly, you should know something for your income also. I hope you are good with this. You don't want me to make you do one question on expense outstanding and all. Okay, come on. Have a look what is the income portion. With regard to income, pre-received income. What is pre-received income? Liability. Liability, opening balance credit side, closing balance debit side. Pre-received income is liability. Accrued income, earned but not received, asset. Opening balance debit side, closing balance. If you receive income, entry is bank account debit to income, receipts and payment account debit to income. In income account, I'll write by receipts and payment. Balancing figure will be to income and expenditure to be transferred to income and expenditure. In income and expenditure related, credit side by income. If you know this, then this will be balancing figure. If you know this, then this will be balancing figure. Depends upon question to question. What's given, what's not given. In income account also, there will be 4 items: opening, closing, receipt, income. If they give 3, you will find the other one as balancing figure. Okay? Very good. So we have good questions to do on that. Same logic will apply to your subscription also. Subscription is one thing that you should be slightly cautious about. Subscription is one thing we should be slightly cautious. If you're finding subscription irritating, I can make you do 1-2 questions on subscription, because anyways we can't spend time on doing the big question. We're doing it as a paper practice later separately. So you want me to do a little bit of subscription practice? Yeah, come on. Let's do a little bit of subscription practice. Little bit of subscription practice. This PDF I've already shared on the Telegram group. I don't know how many of you have seen this in the past or not. NPO is one thing that you're finding irritating. We have a beautiful, colorful sheet to learn NPO from. We'll spend next 10 minutes. We'll learn comfortably the subscription part, because sometimes you get questions exclusively on subscription. No? Yeah, I'll give you a minute. I want you to read this. The coach Rajanna has collected subscription from members, but is not sure how much belongs to current year. How much should be transferred to income and expense? What should be transferred to income and expenditure? Whatever belongs to current year. I don't know how much. Yeah, you should help me figure it out. Yeah, see this. This is the information available. Try and open subscription account. I'll give you a minute. See, if you observe this, opening accrued subscription. Subscription is an asset. Accrued subscription means earned but not received. On the debit side, I would write here to balance brought down. How much is opening accrued? 4,000. Subscription received during the year 50. Received during the year, what is the entry? receipts and payment account debit to subscription. So in subscription account, I'll write by receipts and payment. How much is received? 50. Last line is closing accrued subscription. Accrued means asset closing balance on the credit. I would write here by balance carried down 6. You've written everything. All that you need to find is, I told you, 4 items will come: opening, closing, receipts and payment, income and expenditure. We have opening, closing, receipts and payment. 56 minus 4, 52 will be your to income and expenditure, income earned during the year. You will be usually taking 50 and add 6 and then deduct 4. Am I right? What if instead of giving here subscription received, they are given subscription income for the year? Then we should not add 6. We should deduct 6 and add 4. So in an examination scenario, noticing that one word income received, plus will become minus, minus will become plus is irritating. Very high chance you are risking, you are walking on a knife. Open ledger. You will not take more time. Ledger will take more space in the paper. Time wise, same. There also you write received plus this minus this closing this. I'm writing the same thing. Received plus ಬರೆಯೋದು debit ಬರೀತೀನಿ, minus ಬರೆಯೋದು credit ಬರೀತೀನಿ, and I'll find this. That's it. Because it's all scattered, made to look big. Don't think which looks big will take more time to write, which looks small will take less time to write. No, don't calculate like that. Don't try to save some 10 seconds somewhere and then square, what to say, keep on question your 3 months. I don't have a problem. My exam is over. Oh, I didn't introduce myself. No, I am a chartered accountant. CA final pass agide. But you are CA foundation student. Don't take 3 months extra. Open ledger. Okay, try this one. Quick. Now observe. Pre-received subscription means liability. You have taken the subscription before you even give the service. Opening balance on the credit side. How much? 2. And subscription received during the year is 48. What is the entry when you receive subscription? Cash account debit to subscription. Receipts and payment account debit to subscription. In subscription account, you will write by receipts and payment. How much did you receive? 48. They have given closing 5,000. Closing liability pre-received. I'll write on the debit side. I wrote 5. That's it. Opening is there, closing is there, receipts and payment is there. Balance same figure. 50 minus 5. What is 45? Income earned during that. There is no opening accrued. There is no closing accrued. Easy? Let's see slightly complex one. In this, there is opening accrued, closing accrued, opening pre-received as well as closing pre-received. There are 4 items, 4 balances, opening and closing together. Right? Fine, let's solve this. Observe, opening accrued outstanding subscription. Asset opening balance 4. I'll write debit side. Balance brought down 4. Next up, we have opening pre-received 3,000. Opening pre-received 3,000. And subscription received during the year. In receipts and payment, receipt side, that is debit side. In subscription income, credit side. Next, closing outstanding. This is asset closing balance, credit side 6. And 2,000 closing pre-received, liability closing balance, debit side 2. What to do now? We have opening, we have closing, we have receipts and payment. What do we find as balancing figure? Income and expenditure. Take the total here. 63 plus 6, 69 minus 6. 63,000 is the income and expenditure. Income from the by way of subscription during the year. In subscription income account, you return 2 income and expenditure. In income and expenditure account, you will write by subscription. I hope you got it. Then we have only one small item. How much is subscription received during the year? 30. In receipts and payment, receipt side. In your subscription income account, you will write credit side. What you write? By receipts and payment. They're telling includes 5,000 received for next year. In this 30,000, 5,000 is received for next year. Liability closing balance, debit side. That's it. No other item. 30 minus 5. 25 will be income. Sir, opening, if they don't tell, there is no opening. Why? If it is opening for this year, it means it was closing for last year. If it was closing last year, they would have told no. If they don't tell, it means it's not there. and there is no closing accrued also. Easy? Say something. Very good. This is again a simple question where only outstanding is given. How much is the subscription received during the year? 30. In receipts and payment, receipt side. In subscription income account, credit side. And they've told outstanding is 4. You received 30. You are yet to receive 4. 4 is asset. That's it. Opening, if it was there, I would have given. Because they have not given, opening is 0. Closing we know, receipts and payment we know. Balancing figure is income, 34. Easy ones. We'll understand the last part, and I think then we can understand the basics of our what do you say, balance sheet. Would you need something like this? Rental income 12, received 12. What do you do if income is 12 and received is 12? Income will be 12,000. Receipt will be 12,000. Balance sheet nothing. Am I right? How about income is 12, received is 10. Income will be 10. Receipt will be 10. Income will be 12. Receipt will be 10. 2000 not received will become asset. Help me here. Rental income is 12. Received is 13. Income 12. Received 13. 1000 received extra. Pre-received liability. This will all help you build the concept to do the problem. Big adjustments I put it into small questions. Subscription income is 60. Received 57. What will that be? Income 60. Received 57. 3000 not received. Asset. Accrued income. Done. Then we prepare balance sheet exactly like how we prepare in the case of any other business. Sole proprietorship, whatever we do, same way we'll do it here also. We'll write all assets on the asset side, liabilities and capital on the liability side. Remember, capital is not capital, capital is capital fund. Capital is capital fund. Any surplus or deficit found in your income and expenditure, if it is surplus, it is added to capital fund. If it is deficit, it will be deducted from capital fund. That's it. That's what I want you to know when it comes to preparation of balance sheet. Nothing very new or something here. We've done some basic level questions. Would you want to try one question on balance sheet or not needed? Very good. Then in that case, there are some special items to note. What are the special items? Subscriptions. We have done enough questions, but I think we can do one interesting question. This is the last one I want you to do on subscription. Try this one last question on subscription. Full complex level. Attention. Now focus. Let's solve this. So the subscription in the club is 10,000 per year. How much is the subscription in the club? If you want subscription in the club, how much money should you pay? 10,000. Subscription received in 23-24 for 24-25. You can see 23-24, 24-25, 25-26. You can see 3 years information. I have given here, current year is 24-25. Which year are we in right now? 23-24 is previous year. 25-26 is, I'll repeat, 23-24 is, 24-25 is, 23-24 is, 24-25 is, 25-26 is, Paka. Subscription is received in 23-24. When is it received? Previous year. For which year? Current year. So it is for the current year, but it was received previous year only. So in the previous year, it is pre-received income. Am I right? Opening, pre-received. Pre-received. Before even giving the service, we've collected money. Liability or asset? Liability or asset? Liability. How much liability? 80. How much liability? In the subscription account on the credit side, I'll write 80. Opening, pre-received. I hope you understood.
Yes, sir.
Come on, let's go to the next item. Read the next one. Subscription received in 23-24. 23-24 is previous year. Received for which year? 25-26. What is it? Next year. For the next year, I've collected previous year only. Opening pre-received 30. This 30 will also be closing pre-received. This 30 will also be, here I would write 30,000. Opening pre-received. Same 30,000 will also be closing pre-received, but that's not the only amount which will be closing pre-received. For the year 2025-26, for the year 2025-26, some money is received last year, some money is received this year, all for next year. In this 90, how much was already received last year? 30. How much is received current year? 60. That's how it will become. I'll close it later. I'll close it later. Come on, what do you have next after this? This is done. Next, subscription outstanding for 23-24. Outstanding means what? Earned but not received. Earned but not received. How much? 50. How much? Very good. 50,000 is outstanding for 23-24. You observe here, 23-24 is previous year. Previous year, I've given coaching to a lot of people. They have not paid me 50,000 rupees. It's my asset. Opening balance 50. This will be either received or it will remain closing balance. It will be either received or it will become closing balance. Understood? Then let's go to next one. So we're done with this. Have a look at this. Subscription received in 24-25. 24-25 is current year. For previous year, 35. It is received in current year. In receipts and payment account, receipt side. In subscription account, credit side. How much have we collected during the current year? 24-25, 24-25, 24-25. How much have we collected in current year? 35, 220, 60. 35,000 have collected for previous year. 2,20,000 have collected for current year. 60,000 have actually collected for next year. So I'll write here. See here. 35, 220 and 60. Done. Everything's actually over. How much was outstanding for last year? How much is collected out of it? 15 is not yet collected. Closing accrued. Understood? How much was collected for next year 25-26? In the previous year only I have collected 30. How much did I collect during the current year for next year? Together collected 90. Understood? How much is current year column? Current year column is 2,20,000 already collected. There are 20,000 to be collected and previously collected 80. Add all of this, you will get current year income. That will be balancing figure. Here, I want you to see this ledger in this way. There are 3 years in this ledger. How many years? 23-24 last year. 24-25 current year. 25-26 next year. You are preparing 3 different ledgers in one column. Close the ledger year wise. Close the ledger. Take 23-24. Check wherever 23-24 is there and then close it. Then 24-25 you close. Then 25-26 you close. Close it year wise. Don't close the total ledger at once. That's when you will be able to handle this more smoothly. Any doubt? Should I do it once again? You want one more? Okay? Okay. You want to try? Try. People watching it recorded at a later date, is there anything that's bothering you? I can't answer your doubt live. If in case there is something, please do drop a comment so that I'll be able to see. I can't promise you 100% solution, but I can try to help you with something that I can do with the time that I have before your exam. Let me solve for the help of you people. I want all of you to observe, not talk. See, 24-25 is current year. 23-24 is previous year. 25-26 is next year. Okay. Subscription received in 23-24. Received in which year? Previous year. So it is pre-received income. How much is pre-received income? 60 and 45. Both is pre-received income. Part of it is for current year, part of it is for next year. I hope you got it. So I would write pre-received income as liability. Received in previous year. For current year 60, for next year 45. Together 1,05,000. I hope you got it. If the problem is difficult, try hard. Don't hit the faculty. Then subscription outstanding for 23-24. 23-24 is previous year. For previous year, we've already given service, but we have not collected 75. What is it? Accrued income. Opening. Why? Previous year means opening accrued, no? So I'll write on the expense side. I'm going to say the debit side. Opening accrued for 23-24. 75. Understood? Then after that 75. 24-25. What have I collected? I've collected 15, 3 lakh and 30. 15,000, 3 lakh rupees and 30,000. 15,000 for previous year, 3 lakh for current year, 30,000 for next year. So in my subscription account, I would write whatever is collected. 15, 3 lakh and 30. Together I have actually collected 3 lakh 45,000. This much money is collected in receipts and payment on the receipt side, in subscription income account on the credit side, because it is receipt and payment account debit to subscription. In subscription account, it will be by receipt and payment. Am I right? What's after that? Subscription outstanding in 24-25. 24-25 is current year. Current year subscription not yet received. Closing asset. How much? 22,500. I would write here closing accrued for 24-25 it is 22,500. Am I right? Everything is written. Now we'll close the ledger not totally but year wise. Start from previous year. Start from what is previous year? 23-24. What is previous year? 23-24. 23-24 last year. How much was receivable? Blue alva. How much was receivable for last year? 75,000. 75,000. Out of this 75, how much is received? 23-24. 15. Out of 75, if you receive 15, 60 is still receivable. Am I right?
Yes, sir.
60 is still receivable. That will be closing asset 60. Done. I've closed the previous year column. Next I will close next year column. Next year is 25, 26. Which color? Next year. Next. 25, 26. I'll close next year. Shall I close 25, 26? 25, 26. Already collected 45. Last year collected 45. This year collected 30. Totally how much have I collected extra? 75. I will write here closing pre-received for 25, 26. 75,000. 75,000. So I have closed current year, I have closed previous year, I have closed next year. Now what is left? Current year. Current year is all green. Illi green esto 60. How much was already collected in last year for current year? 60. How much is received in current year for current year? 3 lakh. How much is current year money not yet received? 22,500. We have received 3 lakh in this year, which was collected last year but relates to current year 60, which is relating to current year but not yet collected 22,500. Add them together, you will get current year income 3 lakh 82 Pakka 3 lakh 82,500. Now check the ledger will actually tally. It actually has to tally 82,500. So don't try to close subscription account in total. Close it year wise. First previous year, then next year. Current year will be automatically closed after that. You're getting it? Okay. For those who would want to try, I'll give you one more question to try. PDF I've shared in the Telegram group. You try this at home today and then check. Yeah, you can click a picture of this. You can click a picture of this. Try this, and then I'll tell the answer number. It should match. You try this on your own. PDF anyways I've shared in the Telegram. You guys check it out. If not, drop a message. I'll share the PDF on NPO. Okay, friends. Very nice. Fatafat. Let's go to the next concept. Donation. Can an NPO receive donation? Oh, I did not tell the answer no for that. Which one did you write now? This one, no? 19th one? This is the one that you click picture, or which one? This one only, no? 19th one. So the answer is receipts and payment 2,95,000. This is the answer. This is the answer. Yeah, check if you'll get the same thing. In this, income was given, opening, closing was given. We found receipts and payment as balancing figure. Okay, come on, let's go to the next one. As an NPO, you can collect donation. Donation can be two types: general donation, specific donation. If it is general donation, there is no specific purpose. Just like that, you collected, it should go to income and expenditure. If it is a specific donation collected for a specific purpose, it will be added to the fund created for the specific purpose in the balance sheet. Let's say you collected building fund donation. It's for constructing the building. The balance sheet liability side, building fund will be written, and to that I land. Just like that, generally you collected donation. Write it in income and expenditure as income. General donation, income. Specific donation, liability. If nothing mentioned, assume general. Why? If it is specific, they will specify. If they don't specify, it is general. If it is specific, they will specify. If they don't specify, it is general. I take it. Very nice. Come on, let's go to the next one. I hope you don't need question on this. Okay, then donations done. We'll go forward. Donation for revenue purpose. Entrance fee. If you collect entrance fee, should we treat it as income or should we rate it in the balance sheet as capital fund. Depends upon the size of that entrance fee. If the entrance fee is small amount and regularly you collect it, 10 rupees entry fee to the club. Everyone who enters has to pay 10 rupees. That is small and that is regular. Treat it as income. Treat it as, how about it is large amount and non-recurring. One time entrance fee, 1 lakh rupees, lifetime entrance free. Then that 1 lakh, whatever you collect, it is large amount. Treat it as capital receipt. Don't treat it in income and expenditure as income. Right? Add it to capital fund. If the question doesn't specify, then it is organization policy. What I would suggest, if they don't specify, take it to income and expenditure. If they don't specify, take it to income and when you say entrance fee, what is your expectation? Let's say I have one club. I'll say entrance fee then. What do you think? Huge amount, small amount? Small. If it is huge, I should tell. Entrance fee to our club is 1 lakh rupees. That is huge. If I don't tell, you might think 10 rupees, 20 rupees, 100 rupees will be there. You don't mind paying it every time you enter the club. So it will be usually recurring in nature. It is revenue income. Whereas if it is huge amount, then it will be written as an asset. I hope everybody got this. Say something. Fantastic. Then after this entrance fee, the next one is life membership fee. If you take regular recurring membership fee, subscription, it will be income and expenditure income. What if you collect one time huge amount, life membership? You pay once, lifetime you are member in our club or lifetime you are member in our hospital. All services free to you. So that huge amount, whatever is collected, it is receipt, correct? Don't treat it as income in income and expenditure. Should add it to capital fund. Should add it to lifetime subscription fee or life membership fee collected. Is it receipt? Yes. Is it income? No. Where do you write? Balance sheet. Adding it to capital fund. Got this? Let's go. What's after that? Then you'll see legacies. What is legacy? There's one patient in your hospital. Very good patient. Likes the doctor very much. Before that patient dies in the hospital, you will tell, all my wealth, I wanted to go to this hospital. Why? Because of this hospital only I died. If they would have had this equipment, I would have not died. So I don't want anybody else to die like this. So if they give money, that money what is given towards the end, death of one member of the club or patient in the hospital, if they give money to the hospital or the club, that becomes legacies. What does it become? What is legacy? Legacy is an amount received by an NPO under the will after the death of the donor. Yeah, sir. What if you only keep a knife near the patient's neck and then say sign this or I will kill you? He signed and then you killed him. Like, after he dies only you will get no. So no, that is unethical. But still, if legacy is given just like that, take it, use it for whatever you find right. That will be added to capital fund. If it tells no, use this for this specific purpose. I died because the ball hit my head. I don't want anyone else to die like this. Everyone in our cricket club should wear helmet. So I will give you 10% of my wealth. Take it. Buy helmet for every player in the club. So it's given for a specific purpose. That will be written in the balance sheet liability side under that specific fund name. If it is just given like that without any purpose, then it will be added to capital fund. If a specific purpose is mentioned, it will be added to that specific fund in the balance sheet liability side. Are you getting it? Yeah. So we have an example question on that treatment just of that. And last but one, I guess, honorarium. So what is honorarium? If in case you bring some special people into your NPO to give lecture or to give service, they are very high esteemed profile people. We can't pay them salary. They're not your employee. As a matter of thank you, we'll also give them some money along with thank you, because only thank you might not be good. We will shake hand with some money in that hand. That is called honorarium. Honorarium paid is expense. Honorarium paid is expense. Sometimes in our hospital there is a doctor. We send this doctor to give guest lecture somewhere. He receives honorarium or we receive honorarium. Honorarium received will become income. Honorarium paid will become expense. I'll repeat. Honorarium received will become income. Honorarium paid will become on receipt. It will be written in receipts and payment receipt side. On payment, it will be written in receipts and payment side. Received will become income in income and expenditure. Paid will become expense in income and expenditure. You need to be cautious. Then I think this was the last one. Okay, asset sold, same, yeah. Whenever the asset is sold, selling price, receipt. Book value of the asset, credit in the asset account. Difference will be income or expense. If the sale price is more than book value, income. If the sale price is less than book value, expense in income and expenditure. That's one thing that I wanted you to note. Sometimes they'll give WDV, sometimes they'll give original cost and accumulated depreciation. Be careful. If they give original cost and accumulated depreciation, from the original cost, you deduct accumulated depreciation, then you'll find WDV. Compare WDV with selling price to find profit or loss. And this way you will be able to identify the profit or loss. Profit on sale of the asset, income and expenditure, income side. Loss on sale of the asset, income and expenditure, expenditure side. Sale consideration received, receipts and payment, receipt. Copy, copy. Set. This is what you should know with regard to NPO, and all of that is done. You just need to put all of this together and then apply your common sense and then prepare a full-fledged question like how you do a final accounts question or an incomplete records based question. ಏನಾಯ್ತು ನಿದ್ದೆ ಬರ್ತಾ ಇದೆಯಾ? ಎಲ್ಲ ಇವತ್ತೇ ಆಗ್ತದೆ. ಅಲ್ಲಿ ಬರ್ಬೇಕಾ ಆಮೇಲೆ You what method have you put for selling us? ಸರಿ ಇಲ್ಲ ಲಾಸ್ಟ್ ಟೈಮ್ ಅದೇನೋ ಇಲ್ಲಿ ಚುಕ್ಕ ಇದಕ್ಕೆಲ್ಲ ಬಂದು ಫುಲ್ ಇಲ್ಲೆಲ್ಲ ರೆಡ್ ಕಲರ್ ಲಿಪ್ಸ್ಟಿಕ್ ಎಲ್ಲ ಇರೋದು ನನಗೆ ನಾನೇ ಗೊತ್ತಾಗಿಲ್ಲ. ಐ ನೋ ವಾಟ್ ಆರ್ ಬಿಡ್ ಬ್ರೈಟ್ ತರ ಮೇಕಪ್ ಮಾಡಿದ್ದೀನಿ ಲಾಸ್ಟ್ ಟೈಮ್. ಕೆಲವು ಯಾರು ನಾಯಿದೆಲ್ಲ ನಾಯಿ ಮೂಗು ಕಿವಿ. You guys have seen now you have that all in your WhatsApp video call. On the WhatsApp video, remember WhatsApp video call? Only Snap, huh? Snapping famous, huh? In the WhatsApp video call, you get goggles, you get flying face, and then like smiley face. In the kade clouds ಎಲ್ಲ ಬರುತ್ತೆ. ಬ್ಯಾಕ್ಗ್ರೌಂಡ್ ಎಲ್ಲ ರಿಮೂವ್ ಮಾಡ್ಬೋದು. ಟ್ರೈ ಮಾಡಿಲ್ವಾ ಕಾರ್ತಿಕ್? ಕಾರ್ತಿಕ್ ಇಸ್ ಲೈಕ್ ನನ್ಗೆಲ್ಲ ಯಾರು ವಿಡಿಯೋ ಕಾಲ್ ಮಾಡ್ತಾರೆ ಸರ್? ವಿರಾಟ್ ಕೊಹ್ಲಿ ಇವತ್ತಾ? ಓಕೆ. Incomplete records or what is famously known as single entry system. So in the incomplete records, what really happens is a businessman who started doing business does not understand accounts. It's like if I would have known so much, I would have gone for an employment. Why would have I done business? And he's not doing like big business. No, he's doing small business. Tea angdi, samosa, masala puri, pale puri, dry fruit street side sale, or yene togodi 10 ರೂಪಾಯಿ 10 ರೂಪಾಯಿ 10 ರೂಪಾಯಿ. Something like that. Okay, some small scale business. And this guy does not know how to maintain journal, ledger, trial balance, bank reconciliation statement, rectification of error, subsidiary books. Doesn't know all that. He has one book. In that, whenever he gives cash, he will write. Whenever he receives cash, he will write. Whenever he buys an asset, he will keep the bill with him. Because he understands basic thing that if he buys some furniture, if he buys some machinery, he should keep the bills with him. So he has kept a track of cash paid, cash received. He's kept a track of assets purchased, bills, and he also kept a track who owes him how much. If someone comes to him, buys the goods, and they don't pay money, he will write their name and write the amount. If he has taken inventory from somebody, to them, if he has to pay money, he'll keep a record of it. So he's kept a record of not goods purchased, but he's kept a record of amount to be paid. He's kept a record of not goods sold, but he's kept a record of amount to be received. Is not kept a record of what do you say depreciation and everything, but he has a record of assets purchased. And the problem with this is at the end of the year he wants to know how to find profit, because he wants to know whether to continue the business or shut down the business. He'll go to the accountant and then say, sir, throughout the year I've done all these transactions, I want to know how much profit or loss have I made. Then the accountant will say, sir, where are your journals? Like ledger, He doesn't know. Like journal ledger gotilva. Actually, I will prepare it. Give me all the details. Give me your bank statement. Give me all your purchase invoices, sales invoices, asset purchase invoices. For every purchase, I'll pass one journal entry. Purchase account, debit to cash. Purchase account, debit to creditor. Debtor account, debit to sales. Cash account, debit to sales. Asset account, debit to cash. Depreciation account, debit to asset. I'll pass every journal entry. I'll do bank reconciliation statement. I'll do ledger. I'll do trial balance. I'll do final accounts. Willing to do all that. One person, let's say tea angdi. In a single day, you would have sold some 1,000 times tea. 1,000 invoices are there per day, sales. Even if you write one entry for entire day as sales transaction, you need to write 365, 356 journal entries. 356, no? 360, 365 journal entries you should write. Every day, more than one purchase. He'll purchase milk separately. He'll purchase tea powder separately. He'll purchase sugar separately. He'll buy soap separately. Soap to wash the vessel. And in a year, 12 times rent will be there. Am I right? Every time someone scans and then pays in phone pay. Paytm pay, 10 rupiah, प्राप्त हुआ है. That 10 rupees one transaction is there in your passbook. You have to pass one journal entry for that. Are you getting it? You are the accountant. You should do accounting. How much time will you take to do all this? 15, 20 days you will take. For everything, if you have to pass journal entry, prepare ledger, prepare trial balance, final accounts and everything. And you should know good knowledge of accounts also. 14 marks problem only, you are crying. Imagine you should do 1,400 transactions. Should be really good also at it, no? You also need laptop, you need software, you need skills, you need knowledge, you need data. Then 14, 15 days will take to do. As a chartered accountant who knows all this, how much money will you charge that for 15 days of your time? After you become chartered accountant, you put in so much of time and effort. In a single month, you want to earn 3, 4 lakhs. 15 days, if you are giving to one client, you expect at least 2 lakh rupees fees. You will ask that Angdi uncle, 2 lakh rupees fees. That uncle will be like this. Then Angdi 2 lakhs rupai. My shop fully, if I sell, I will get 2 lakh. And I won't even make 2 lakh profit. To compute how much profit, that 20,000 profit I made, I should give you 30,000. I should give 2 lakh rupees. It is not going to work correctly. But that doesn't mean you do it without charging the fees. So much effort is there. That's the reason you are asking so much fees. So that business is so small, no? You want to know how much is profit, but you don't want to maintain complete records. This solution is called as incomplete records. You keep it incomplete only, but you find the profit. Incomplete records, you keep it incomplete only, but you find the profit. Are you getting it? So it is called single entry system. Is not recorded two aspects of a transaction. Is written only one aspect of a transaction. Using two aspects, you can prepare journal, ledger, trial balance, find P&L. But without writing the missing second aspect, you still want to find profit. That is called statement of affairs method. What is it? Statement of affairs method. So how does this statement of affairs method work? Very simple. He is maintaining single entry. He doesn't want to double, meaning he doesn't want to follow double entry. What you do, he'll have an affair, statement of affairs. So simple. Last year you would have done balance sheet. Last year you would have known how much is his closing capital. Am I right? Or if this is the first year of business, on the starting of the business, how much business capital did you start with? You would know cash. Am I right? Sir. During the year, how much money did you put additionally? I will ask. You will tell. During there, I put 10,000 here, I put 5,000 here. You will tell. If he's withdrawn some money, he will tell I withdrew 5,000, I withdrew 4,000. He'll tell all that. Are you getting it? At the end, I'll ask him what assets do you have? Asti pasti yenide. He will show all of this is my asset. I have this cooker, I have this stove, I have this building, I have this rental advance, I have this furniture, I have these utensils. He'll tell all the assets. He'll tell all the liabilities. He'll take all the assets that he has, all the liabilities that he has, I'll deduct. I'll get closing capital as balancing figure. It is like in balance sheet, I'm finding balancing figure. I'm finding balancing figure in balance sheet. In balance sheet, I'll write all assets, all liabilities. I should find the capital and tally the balance sheet. Here, I'll find capital as balancing figure. So this will be not called as balance sheet. This will be called as statement of affairs. What will this be called as? Statement of affairs. That way I found closing capital. I know opening capital. I know additional capital. I know drawings. I know opening capital. I know additional capital. I know drawings. I know closing capital. We know opening capital plus additional capital minus drawings plus profit is equal to closing capital. So I know closing, I know opening, I know additional capital, I know drawings. I will find profit as balancing figure. Are you getting it? Usually profit and loss account, what will you write? sales, other income, expenses, salary, depreciation, rent, interest, and find balance and figure. Here we don't do that. Here we don't do that. Opening capital, closing capital difference, whatever is there, we find it as profit. This we are not trying to do scientifically. We're not trying to do systematically. We're not trying to do cleanly. We only want to know the profit. That's the reason we call this statement of affairs method. What is it called? Usually, the moment you say profit, what comes to your mind? Expense and income. Here, we don't follow expense and income nature only. So, there are actually two approaches, like I was mentioning. One, conversion of single entry to double entry. This is detailed maintenance of accounts. We open trading, we open P&L, and then we find net profit, write it to balance sheet, and then tally the balance sheet. This is permanent solution. Converting single entry to double entry. Whereas, you want one quick solution. You don't want exact scientific concept. You just want one answer. Statement of affairs method. Opening capital is known from previous year. In this year, what do we do? In the balance sheet, I'll find closing capital as balancing figure. And like I mentioned, no, this is how we find closing capital. Usually, this is the flow. Am I right? Opening plus additional minus drawings plus profit is equal to closing capital. Opening plus additional minus drawings plus profit is equal to closing capital. Here, I know opening, I know additional, I know drawings, I know closing. I want to find profit. What do? This profit, let it be here. Because you send profit, this side it will become negative. Send all of these items, opening capital plus additional capital minus drawings to this side. It will be closing capital minus opening capital minus additional capital plus drawings. That will give us profit. And this is there, no, this is nothing but capital account. We will call this statement of profit or loss. What do we call this? Statement of profit or statement of profit or loss. What is it? Statement of profit or loss. I hope you understood this. Say something, yeah. Okay. What I want to note, what I want all of you to remember is when you do incomplete records questions, question can be on statement of affairs method also. Questions can be on conversion of single entry to double entry also. Don't focus only on conversion of single entry to double entry. You can get questions on conversion of single entry to double entry also. Got it? Conversion of, sorry, you can get questions on statement of affairs also. That conversion of single entry to double entry is same as final accounts. It is very similar to NPO, nothing new. What is new? Statement of affairs. One last time. What is statement of affairs? Balance sheet tara, balance sheet alla. Looks like, but it is not. Why is it like balance sheet but not balance sheet? Because we find capital as balancing figure. In balance sheet, we write capital and find tallying the balance sheet. Are you getting it? We find the closing capital as balancing figure. We would know opening capital. Difference between opening and closing capital will be found as profit. Are you getting it? That's with regard to incomplete records that I want you to note. We put full incomplete records on the YouTube channel. I don't know how many of you have seen. Full incomplete records is there in the YouTube channel, free, full chapter. In May 2024, when this chapter first got introduced newly, to help the students who would have prepared under old scheme but were supposed to write the exam under new scheme. Before May 24, incomplete records was in CA Inter. After May 24, it came to CA Foundation. So it's been put. If you are finding it very difficult, you can watch it. But I'll give you a couple of more tips that you should know. Whenever there is an adjustment, now I'm talking about conversion of single entry to double entry. Work with ledgers. Work with ledgers. Open ledger. Debtor account, creditor account, bills receivable account, bills payable account, expense account, income account. For each expense, one ledger. For each income, one ledger. And then debtor, creditor, bills receivable, bills payable. Common places of mistake. Always first close bills receivable account before closing debtor account. Always first close bills payable account before closing creditors account. If there is outstanding expense, prepaid expense and expense, write everything in one ledger. Outstanding expense is liability, opening credit, closing debit. Prepaid expense in the same ledger, opening debit, closing credit. If they give paid, find the current year expense as balancing figure. If they give current year expense, paid will be found as balancing figure. Same logic what we did in NPO. If someone is doing NPO, they can always do incomplete records. They can always do conversion. Sorry, they can always do final accounts of sole proprietor. All the three chapters are in the same line. In these three, if you say I know one, I don't know two, you are not understanding that all three are connected. All the three topics are connected. If you can do one among these three, you can do the other two also. Don't blindly be like, I'll skip some chapters. Which one will you skip? I'll not do NPO, but I'll do single entry, but I'll do final accounts of sole proprietor. It's the same logic. Just have to practice some problems. Firstly, skipping is a mistake, and unscientifically skipping is bigger mistake. Is that fine? That way, I would say this topic of incomplete records is. We will start with partnership next.
Let's start with chapter 10 of our syllabus, partnership accounting. When you talk about partnership accounting, there are several units that will come under partnership accounting. First unit is introduction, second unit will learn admission, then we learn retirement, then we learn death, and lastly dissolution of partnership form. To begin with, what is partnership? What is including partnership? What is not including partnership? The definition is given in Partnership Act 1932. The definition is like this. So different people have different skill set, different people bringing different skill sets together and together making a beautiful movie for us to watch is partnership. For instance, partnership is an association of persons, two or more. In that case, in that example that you saw, there are three, and not all of them should work. Are you getting it? It's an association of two or more persons coming together for the purpose of business, where they share profits and losses which arise from the business, where one of them is acting for all, or all of them are acting for all. So, activity is carried on by all, or any one of them acting for all. Either of the cases are included, and that's what we call as partnership. I hope you understood. Can we call wedding or marriage a partnership? Think association, usually two people, usually not always do, and profits or losses they share. If you cook, I lead. If vessels have to be washed, we'll wash together. Clothes will wash together. If I make loss, you make loss. If you make profit, I make profit. Activities carried on can be carried on by all, or one of them acting for all. Cannot be a contract only. Okay, first, keep partnership aside. Is it firstly an agreement? Yes. But is it a, what they say, partnership? Because there is no business. Business is a key word. In case there was no business word in the definition, then marriage would have become partnership, complex. And Partnership Act 1932 will be applicable to any active partner, silent partner, dormant partner, secret partner, person who's not a partner but acts like a partner, person is a partner but doesn't act like a partner, minor admitted to the benefits of the firm, admission of a partner, retirement of a partner, death of a partner, dissolution of partnership. Oh God. ಅದೇ ಹೇಳ್ತಾರೆ all not there. So basically what you have, association of two or more person. What do you mean by more? How many more people can be there in partnership? Two, okay. More means 50. Any other number? Okay. Imagine this specific movie. The limit on maximum number of partners depends upon two things. One on the act, second one on the rules. Now, based on the act, you remember this scene? Yeah, in that RRR movie, he will take that lathi, jump at the net, to everyone. Something like that. If you do something wrong, no, long ago, cops used to take the lathi and then like hit. Get what I'm trying to say? So when they hit, where do they hit first? In this specific scene, if you remember, the cop hits, no? If you are a cop, you have a lathi. Where do you hit first? Sweep shot on the legs. You'll go for a 4. Are you getting it? If in case someone starts holding their legs, they'll play a hook shot on the back for a 6. And again, when you hold your back, again they'll play a sweep shot on your legs for a 4. So that's how they thrashed us also, no, yesterday in the game. So section 464 of Companies Act 2013 puts the limit, not the Partnership Act, saying that any association, if it has more than 100 people, it has to be registered under the Act. If it doesn't get registered, then it will be considered as an illegal association. This section 464, is it of Partnership Act or Companies Act? Companies Act, not of Partnership Act. The maximum limit of partners is actually not given under Partnership Act 1932. It's given under Companies Act 2013, which says that the maximum number of people which can be there in a form of association, which is not a partnership, which is not a company, is 100. But you remember reading 50. How does it work? That is basically given in rules. As per rules, it is restricted to 50. But as per act, it is 100. Should you follow act or should you follow rules? Both. Should follow both. If you have 60 partners, it is still in compliance of the act, but non-compliance of the rules. So The maximum limit which was previously given under Companies Act 464 section is 100, but the limit is restricted to 50 by way of company rules. So basically, if you have more than 50 people in a partnership firm, there is no problem with Partnership Act 1932, but you will be called as an illegal association under Companies Act 2013. So if you have more than 50 people, you should get registered as a company or an LLP under basically MCA. If not, it's called as illegal association. There are exceptions also to it. If it is a professional body, then there is no limit. You can cross that number. Fine. Let's keep that aside. For now, purpose of business very important. If you don't have business, then even wedding will become a partnership firm. The next point that I want you all to note is profits or losses. The partnership firm can be created for the purpose of profit, or you can also share the losses. Whereas there can be certain partners who be admitted exclusively for the purpose of profits. That's an option available. See, provisions allow you to have a partner who will share only profits. It's like, is there profit? Count me in. If there is loss, sorry, I'm out of it. Can there be such partner? Yes. So this is called as partner in the case of profits only. And activities carried on can be carried on by all the partners, or it can be carried on by one of the partners. That's also a possibility. This is what we call as a part of our definition. And when we talk about partners, it can be active or inactive. One of them will be like, I'm good at accounting, I'll do accounting. I am good at operations, I'll take off operations, because one person's legs are not working, one person's brain is not working. So possible. Yeah, provisions allow partner to be either active or inactive, sleeping or dormant. Then what is the difference between partner, partnership and partnership firm? Are they all same or are they different? Different. Individually, they are called as partners. Togetherly, when they come, it's called as partnership. That is a relationship that they have between them. The name under which they work is called as partnership firm. So partners are the natural persons, individual personalities. The association that they have between them is called as partnership, and the name under which they do their entire business is called as partnership firm. The next point to notice, what is constitution of partnership? Constitution of partnership is partnership deed. In company, you have articles of association, memorandum of association. In partnership, you have partnership deeds. This is the constitution of partnership. In this only you mention the name of the partner, the business of the partner, what is the address of the partnership firm, what will they do in the partnership firm, which partner gets how much profit, which partner should contribute how much capital, will they get interest on capital, will anyone get salary, what to do if they withdraw money, what if someone is poor, what if someone is dead, what if someone wants to dissolve the firm, how to deal with dissolution, everything is actually given in partnership deed. Partnership deed can be oral, can be written. They can agree upon it orally, or they can write it on a piece of paper and sign. But can the partnership form be registered mandatorily? Is it mandatory to get it registered? Can it be an unregistered form? It can be unregistered form. But if the partnership has to be registered, you need partnership deed. You go to ROF, Registrar of Firms. In the list, it is a state list. It's not in the union list. Here you can go to your Tahsildar office, which is there here only Jayanagar. You can get your registration of the firm done. When you go there, the registrar, Tahsildar, wants to put the seal that the firm is an artificial person. Where does he put the seal? On the deed. What if you say our deed is oral? Then open your mouth. On the tongue will they put the seal? No. Partnership deed, if it is there, the firm can get registered. If the deed is not in writing, firm cannot get registered. Registration is optional, but if you want to get the registration done, partnership deed has to be in writing. You cannot write on one tissue paper. It has to be written on a stamp paper. You need to pay the stamp duty. You need to register it in the ROM. That's when the firm will get registered. What is the advantages of registering? What if the firm is not registered? If it is not registered, it's not a real person. It's not an artificial person. It's not a person in the eyes of law. So outsiders can sue you, but you cannot sue on outsiders. If you are cheated by somebody, then you are a person, no? Show me how are you a person. Partnership deed. If you don't have partnership deed, you are non-existent person. If in case you being cheated by somebody, I don't care. But if you cheat someone, I will sue you. So if partnership deed is unregistered, what will happen? Outsiders can sue the firm, but firm cannot sue outsiders for an amount exceeding 100. What is this logic of 100? Long, long ago when Partnership Act came in 1932, 100 rupees was a big amount. Then they told, if you're doing business, small businessmen, then you don't have to register. And if you don't register, small businessmen, I will still give you coverage of law. If someone cheats you up to 100 rupees, you can file a case. If someone is cheating you for an amount greater than 100, then you are dealing with huge amount. You are a big person, register yourself under Partnership Act. That was the reason they told 100. After that, by time, they had to increase this number. They did not increase. Why? They wanted everyone to register so that the law comes into force. So the government understands who's doing what business. To keep that track and to keep that track of who's doing what, they didn't want anyone to skip the registration. So they did not increase the number and number remained at 100 to today's date. What are the contents in partnership deed? Several things. Name and address of the firm, name and address of the partners, name of business, role and responsibility of partners, however they are sharing profit, what to do in the case of death, admission, retirement, how much contribution of capital should who do, will they get salary, will they get interest on capital, interest on drawing, how to compute goodwill, everything will be agreed upon in partnership deed. The next point is, what if partnership deed is absent, not there? Or what if partnership deed is silent, there, but it doesn't talk about certain things? What to do? Never heard of? In this case, you should apply section 13 of Partnership Act 1932. Partnership Act 1932 section 13 tells terms that will apply to a partnership firm in the absence of partnership deed. What does it say? Section 13 says that if in case there is no partnership deed, no remuneration. No remuneration. Sir, I am active partner, sir. He is sleeping partner. He will sleep from night 9 o'clock to morning 8 o'clock. He will wake up, he will brush, he will eat breakfast, and again he will sleep from 8 o'clock to 1 o'clock. 1 o'clock he wakes up, he has lunch, again he sleeps from 2 o'clock to 6 o'clock. 6 o'clock he wakes up, he watches Big Boss, he has dinner, and again he sleeps all night. Still, he will also get no remuneration, he will also get no remuneration. Sir, but I am working. I want remuneration. Then take partnership deed. In that you put one clause. I am active partner. I will take salary. He is inactive partner. He will not take salary. Mention that. Both of you sign. Register it. Then you can take salary. Otherwise, no partner gets remuneration. The next point. Profits are to be shared equally between. There are three partners. 1:1:1. Four partners. 1:1:1:1. Sir, but my capital is more than his. Still, you can only take same amount of profit as much as his. If I contribute 10 lakh rupees and you contribute 100 rupees and both of us together start a partnership firm, but we don't have partnership deed, still we both should share profits equally. If you want to share profits in any specific ratio, mention that in the deed, register the deed. Only then you can take profits in any other ratio. Otherwise, profits are to be shared in equal ratio. No interest on capital to any partner. Sir, I contributed 10 lakh. He contributed 1 lakh. I have contributed more than him. Okay, if the profits are shared equally, at least give me interest on my capital. No, will not be given. If you want interest on capital, mention that in partnership. Get it signed by both of. Put in place. Only then you can take. Next one, interest on advance. If as a partner you have contributed money more than your capital, extra contribution made is called as advance. On such extra contribution made by the partner into the firm over and above his capital, he will be eligible for interest at 6% per annum, computed as simple interest. Then the last but one point, or the last point, I think the last point, yeah, last but one. Firm will indemnify the partner for expenses and liabilities. If the partner incurs some expense on behalf of the firm, if the partner makes some payments on behalf of the firm, partner had to not pay, firm had to pay. So firm will pay him for it. Are you getting it? And the last point is, all the partners have equal rights and responsibilities. Because of the partner, if the firm undergoes any loss, the firm has to be compensated by the partner. If my expense, I let the firm pay, I have to pay that money to firm. If firm's expense I pay, firm has to pay me that money. So all of them have equal rights and responsibilities. If because of you firm goes through difficulty, you should compensate. If you go through difficulty because of the firm will compensate. These are the points given under section 13 of Partnership Act 1932 to follow if the partnership deed is not there. Can you have a different terms than this? Yes, if you mention in partnership deed. When will this section become applicable? When partnership deed is silent or not there. Let's go to the next point. Then we prepare a beautiful account in the case of partnership called as profit and loss appropriation account. What do we prepare? Profit and loss appropriation account. I mentioned this when we were doing final accounts, but did not talk about it in detail. The reason is we are supposed to talk about it now. Is profit and loss account and profit and loss appropriation account same? They are different. How are they different? What is the difference? In profit and loss account, we write all expenses and income. In profit and loss appropriation account, we write appropriation of incomes. Are you getting it? Did not understand. In your business, to let the business run, you paid rent, you paid salary, you paid electricity bill, you purchased inventory, you sold inventory. All of these are P&L items. After this, you want profit. You give that profit to your wife. Is that expense? No, that is appropriation. To transport money to reserves, appropriation of income. As a company, you declare a dividend, appropriation of income. Appropriation of income is done when you have income. Charge against income is charged to find the profit. So charge means reduction in profit. It's like expense. Appropriation means after you find profit, what you do out of that profit is called as appropriation account. If the partnership firm pays interest on capital to partners, it is not expense. Is it expense? No, it is appropriation of profit. It is appropriation of profit. Partnership firm pays salary to partner. What is it? It is not expense in P&L. It is appropriation of income. If the partner has withdrawn money from the firm, so partnership firm will charge interest on drawings. Partner will pay money to partnership firm. It is not income in P&L account credit side. It is appropriation of income. Basically, you will read it in P&L appropriation account. Are you getting it? See, partner is representing firm. There is no big difference between partner and partnership. Partners together form partnership, no? Any money paid by the firm to the partner or any money paid by the partner to the firm, it will not come in P&L account as expense and income. It will come in profit and loss appropriation account. I'll repeat, any money paid by the partner to the firm or paid by the firm to the partner will not come in P&L account. It will come in P&L appropriation account. Where will it come? P&L appropriation account. I hope you understood. Bonus issue, right issue comes in company. And in company, we don't have concept of P&L appropriation. For corporate entities, there is no concept of appropriation. Are you getting it? Under old format, we used to do horizontal. There we used to do P&L appropriation. Now, when we do Schedule 3 format, all these payments are called reserves and surplus fund. It will not come in P&L. There is no concept of P&L appropriation in company account. It is appropriation of income, but you should not tell it. Are you getting it? It is reserves capitalized. That's the better word. You're getting it. It is lemon juice, but you should tell lemonade. Same thing. You squeeze lemon, you put salt, you put sugar, you mix to put 2 ice cubes and then give. But lemon juice is 10 rupees. Are you getting it? Lemon rasa is 5 rupees. Lemonade 100. Yeah, if you can put one umbrella on it and then give it in a beautiful looking glass, you can call it virgin mojito and charge 1000 rupees also. So it depends upon what name do you give. Okay, focus. So profit and loss account and profit and loss appropriation account are not same. So the objective of P&L account is to find net profit. Objective of P&L appropriation account is to appropriate the profits that is earned. And this consists of expenses and incomes. And P&L appropriation account consists of distribution of profit to stakeholders and transfer of profit to reserves. What does it include? Distribution of profit to stakeholders and transfer to reserves. Order. What do we have in P&L? P&L comes first or P&L appropriation comes first? First earn profit, then you appropriate it. So P&L is the predecessor of P&L appropriation. P&L appropriation is successor of P&L. I hope you got it. Then example for items that you write in P&L appropriation account in the case of partnership is remuneration to partners, interest on capital, interest on drawings, share of profits distributed to partners. All of these are P&L appropriation items. Remember, transactions between partner and partnership firm is not charged against income. It is appropriation of income. To show you how P&L appropriation account looks. In P&L, we find profit. On the debit side, excess of income over expense. Credit side, income is more. Debit side, expense is less. Debit side, we rate net profit. That is brought down to P&L appropriation account. Now, tell me what are the things that the firm will collect from the partner. Firm will collect interest on drawings. What will firm pay to the partner? Interest on capital, interest on advance, salary, remuneration, commission. All of those payments what they make, I'll write on the debit side. Partners capital, you pay them remuneration, you pay them interest on capital, you receive interest on drawings from them, and you pay them interest on advance as well as share of profits. If you give them share of profits, debit side. If in case there is loss, it will be written on the credit side. and this is how you close your P&L appropriation account. Items increasing the profit on the credit, items decreasing the profit on the debit. I hope you got it. Now there are four important things that I want you to note here, which we'll discuss each of them at last. First one, remuneration to partner. Second one, interest on capital. Third one, interest on drawings. Fourth one, partners capitals share of profit. Shall we begin? Let's begin with remuneration to partner. How do we compute remuneration to partner? How do we compute remuneration to partner? It can be given either as a fixed amount or a fixed percentage. And I think we'll discuss capital accounts before that. After we prepare P&L appropriation account, we need to do capital accounts of the partners to identify how much capital belongs to each partner. The capital systems maintenance can be done under two methods. One, it can be either done under fixed capital system or fluctuating capital system. What do you mean by fluctuating capital system? Under this, the capital keeps fluctuating. It will go up, down, up, down, up, down throughout. It is not same. It is not same. If there is 10 rupees drawings made, capital will go down. If they bring 100 rupees into the firm, capital will increase. Interest on drawings, interest on capital, salary, everything is changing the partner's capital. So let's say 1st of April, his capital was 1 lakh. At the end of 1st of April, capital is 1 lakh 10,000. Second day end, it is 1 lakh 18,000. Third day, 93,000. Fourth day, 1 lakh 2,000. Every single transaction the partner is doing is affecting the capital. Capital is throughout the year changing. I'll tell you the problem here with this system. At the end of the year, if you want to compute interest on capital, on what do you compute? Every day the balance is changing. On which day's balance do you compute interest? ಆ ಥರ ಇದ್ರೆ ಏನು ಮಾಡ್ತೀನಿ ಗೊತ್ತಾ? ಫಸ್ಟ್ ಡೇ I'll deposit 10 lakh rupees as capital. Second day I'll withdraw 9 lakh. Throughout there it's 1 lakh rupees. Again next year beginning I'll deposit 10 lakh. I'll get interest on 10 lakh. But my capital throughout there is 1 lakh. But I have to compute interest on daily average balance. I have to compute it on daily average. Very irritating, no? That is the reason entities go by fixed capital system. Under fluctuating one ledger, everything in that ledger only. Everything is there in. But what do you do under fixed capital system? You maintain two ledgers. One is capital account, other one is current account. Under fluctuating, only one account, capital. Under fixed, you open two, capital account, current account. The advantage of two is, as per partnership deed, your capital is supposed to be 10 lakh. Opening 10 lakh, closing 10 lakh. That's it. Sir, what if there is interest on capital, salary, remuneration, revaluation, profit, goodwill adjustment, interest on advance? All of that will be written in current account. All of that will be written in. So that is fixed capital system. Under fixed capital system, the fixed capital will be capital as per deed, opening, closing. That's it. All the transactions will be there in current account. Under fluctuating capital system, what do you do? Opening balance, closing balance, and all the transactions. Everything is written in one ledger. Everything is written in, because everything is written in one ledger, the balance keeps, the balance is not the same at all. I hope you understood. See, this is how fluctuating capital will look like. Can you see this? Read the items what is there on the credit side. Opening balance followed by additional capital. Whatever items will increase the capital will come on the credit side. Whatever items will decrease the capital will come on the debit side. Help me with the items which is come on the credit side. Additional capital. Then remuneration to partner payable by the firm. Then interest on capital payable to the partner by the firm. Then interest on advance payable to the partner by the firm. So basically increases capital, including share of profit. Look at debit side. What do you have? Drawings, interest on drawings, share of loss. These are all the items decreasing capital. At the end we'll find closing capital. You understood fluctuating capital system? Under fixed capital system, what I'll do is this opening balance, closing balance, I'll write in one ledger. All these nonsense items I'll write separately in one more ledger. Observe. Can you see? In fixed capital system, opening, closing. If there is any drawings as per partnership deed, I will write. If there is any additional capital as per partnership deed, I'll write. I won't write anything else. Capital will be always as per deed. If I have to compute interest, it is easy. I'll compute it on the balance in fixed capital. On the current account balance, they will not give any interest. And in the current account, I'll put all the nonsense items. Opening balance, can be debit, can be credit, interest on capital, interest on drawing, salary, remuneration, commission, everything. Share of profit, share of loss, goodwill adjustment, everything will come here. Which one to follow is entity's choice. They can follow either of the methods. Got it? Next, we'll discuss that 1, 2, 3, 4. When I discussed capital account, I told you no many things to discuss. What are the things that, sorry, when I discuss P&L appropriation, I told you know 1, 2, 3, 4. What is 1? 2, interest on capital. 3, interest on drawings. 4, share of profit. Now we'll discuss remuneration to partners. Remuneration can be given as a specified amount. If they give specified amount, good. That much money is appropriation of income. That much money is paid to partner. Because it is paid to partner, in the partner's capital account, it is credit side. It can be current account or capital account, depending upon the system. In P&L appropriation, anyways, it will be on the debit. However, what if they say partner's remuneration as a percentage? I taught this to you when we did final accounts. Partner can be given remuneration as a percentage of profit. That percentage can be on before charging basis, or that percentage can be on after charging basis. I'll repeat, that percentage can be on before charging basis, or that percentage can be on after charging basis also. I hope you understood. Say something. If it is on before charging basis, then profit multiplied by that x percentage means x by 100. If that is after charging basis, please do profit multiplied by x divided by 100 plus x. Add that percentage to the denominator also. If they say 10% on before charging basis, what do? Profit into 10 by 100. What if they say after charging basis? Profit into 10 divided by 110. Are you getting it? Next point I want you to know is interest on capital. Remember, will we give interest on capital on the capital balance fixed or current account balance? Capital balance which is fixed. We give it on the fixed capital balance, not on the fluctuating current account balance. I hope you got it. Then interest on drawings. How to compute interest on drawings? Depends. If the drawing is one time, the partner withdrew once 10,000 rupees on 1st of January. Then what to do? January you have withdrawn, year ending is March, January, February, March. 3 months interest, P into T into R. P, amount withdrawn 10,000. Time 3 months. Rate of interest 8%, 10%, whatever. You will compute interest on drawings. What if the amount is withdrawn multiple times? What if he withdraws 10,000 at the beginning of every month? Then first 10,000 drawing is for 12 months. Second 10,000 drawing is for 11 months. Third 10,000 drawing 10 months. You should do 12 months, 10, 11 months, 10 months, 9 months, 8 months. Too much to compute, no? So we can follow a shortcut. We can follow a shortcut. What is a shortcut? Very simple. If the same amount is withdrawn at the multiple periods, at exactly the same dates, like every month first I'm withdrawing 10,000, or every month middle I'm withdrawing 10,000, or every month end I'm withdrawing 10,000. In that case, I can apply the shortcut. What is the shortcut? Maximum period, if the amount is withdrawn at the beginning of every month, is 12. What is the minimum period? 1. So you take average 6.5 months. On the total amount of drawings, you apply 6.5 months interest. You will get it right. For example, if a partner is withdrawing 10,000 at the beginning of every month, the partner is withdrawing 10,000 rupees at the beginning of every month. Do 10,000 into 12 total drawings 1,20,000 multiplied by average drawings rate, which is 6.5 months divided by 12 into whatever is the interest rate, and you get the total interest amount. Are you getting it? If you're not getting good hold on this, let me tell you how can I help. If you discuss only the theory part, you might not be able to make much sense out of it. So I'll give you a beautiful question. Please try this, and then I'll be able to help you better. So this is the question that I want you to compute answer for. Take a pause and then try, and after that you listen to me, then you'll understand better. Compute interest on drawings. Listen to me. People who are watching it recorded, I would suggest you to take a pause here, solve this question, and then continue to listen to my explanation. If the amount is withdrawn once, we can compute the interest just once on that amount from the date of drawing till the year end at the percentage that's mentioned. Whereas if the amount is withdrawn every month, on the first drawing made in the first month, 12 months interest, second drawing made in the second month, 11 months, third drawing 10 months, fourth drawing 9 months, 8 months, 7 months, 6 months, 5 months, 4 months, 3 months, 2 months, to do so much of computation. Isn't it too lengthy? Isn't it too much to do? Isn't there a shortcut? Yes. The first drawing that is made, let's say at the beginning of the first month, 12 months is the outstanding period. Last drawing you would have made at the beginning of March, for which the outstanding period is 1 month. Highest 12, lowest 1, 12 plus 1 divided by 2. 6.5 is the average. On the total drawings, not monthly drawings. On the total drawings, if you compute 6.5 months interest, you will get the answer right. See this? On total drawings, what you would have done? 1000 per month for 12 months, 1,20,000. I'll compute interest for 6.5 months. At 10%, I'll get 650 as the answer. This is one commonly done mistake. What I've seen people do is they take 1000 into 6.5 by 12 into 10%. They forget that they should take total drawings because they mug this up as a formula, but they don't remember the logic of it. How many of you did 1000 into 6.5 by 12 into 10%? Common mistake. Not just you. Many people do this in the exam also. Why? They think that it is a formula. It's not a formula. It's logic. First drawing 12 months, last drawing 1 month, average period 6.5 for total drawings. For total drawings. If the amount is withdrawn at the beginning of every month, what is the average period? 6.5. Observe. What if the drawing is made in the middle of every month? First drawing is made 15th of April. What is the maximum outstanding period? 11.5. Last drawing is made on 15th of March. What is the outstanding period? 0.5. So 11.5 and zero point 0.5. Together if you add, it will become 12. Divided by 2. Average period is 6. You compute interest for 6 months. What if you do the drawing at the end of every month? First drawing is made at the end of April. Remaining period is 11. Last drawing is made at the end of 31st March. Outstanding period is 0. 11 plus 0 divided by 2. 5.5. You actually compute interest for 5.5 months. You getting it? What if it is at the beginning of every quarter? Divide one full year into 4 quarters. Divide one full year into 4 quarters. What are the 4 quarters? April, May, June, first quarter. July, August, September, second quarter. October, November, December, third quarter. January, February, March of next year will become fourth quarter. If you withdraw the money at the beginning of the first quarter, outstanding period is 12 months. If you withdraw the money at the beginning of the last quarter, 3 months will be remaining. Maximum period 12 months, minimum period 3 months. 12 plus 3 divided by 2, 7.5 is the average. If you do in the middle of the quarter, it is 6. If you do at the end of the quarter, it is 4.5. So, on the total drawings, when you apply total interest percentage, the period or time that should be taken will be the average. This is a shortcut. I hope you understood the average. What is the average period for which you will compute when the amount is withdrawn at the beginning of every month? You should wait for me to tell month. What if it will beginning? After you tell 6.5, I will tell at the beginning of every quarter. And the answer will change. At the beginning of every quarter, if you withdraw, you will apply average period of 6.5. Beginning, sorry, every month, middle of every month, end of every month, beginning of every quarter, middle of every quarter, end of every quarter. Very good. What if you withdraw the money on a random date? They don't mention the date when you withdraw. Then you would have to apply average period. Yeah, 6. Why is it 6? It could have been withdrawn on the first day. It could have been withdrawn on the last day. First day, 12 months. Last day, 0 months. So 12 plus 0 divided by 2. 6 months is the average period. I hope you got it. What if you withdraw random amounts on random dates? It's not 1st April, 1st May, 1st June, 1st July, 1st August. 1st April, 10th May, 21st June, 18th August, and then 19th September, 1st of October, 15th November, random dates. And amounts are also not 10,000, 10,000, 10,000, 10,000. No, 10,000, 11,000, 3,000, 1,000, 2,000. Random amounts. Then what do you do? You would have to apply product method. Product method is not some new format. How do you find interest? What is the formula? P into T into R. P into T into R. P means amount. Amount is changing. Time is also changing. Rate of interest is constant. Rate of interest is constant. So what do you do is we do P into T total and do into R at once. It is P into T into R. So P keeps changing, T keeps changing, R is constant. So you do P into T, take the total of P into T for first drawing, P into T for second drawing. 10 drawings are there. For 10 drawings, P into T, P into T, P into T, you take. Once for all, you will apply R. Another point to note, first drawing is, let's say, 1 month. Second drawing is 3 months outstanding. Third drawing is 8 months. If you write it, you write 1 by 12, 3 by 12, 8 by 12. If drawing is 60 days, we'll write 60 by 365, 80 by 365, 90 by 365, 84 by 365. Denominator is common, no? So denominator also can be applied once for all. So in product method, what we do in this example of ours, it is 1st of May, 15th of August, 30th September, 1st Jan, 1st March. Everything is in the middle of the month, beginning of the month, or end of the month. When you apply the period, it will look somewhat like this: 11, 7.5, 6, 3, 1. So what can you do? 3000 into 11 by 12 into 10%. 2500 into 7.5 by 12 into 10%. 4000 into 6 by 12 into 10%. Here what is common in everything? Divided by 12 multiplied by 10%. Isn't it common? So for every item, instead of doing divided by 12 into 10%, divided by 12 into 10%, what to do? Don't do that. You do 3000 into 11, 2500 into 7.5, 4000 into 6. Do that. Take the total of the product. On 81,250, once for all, you divide by 12 and multiply by 10%. You will easily get the answer. Again, this is not a format. Logic. I want you to know logic. If you know the logic, you don't have to mug up. If you don't remember the logic, if you mug up the format, if you feel little anxious, if you feel little tensed, if you get little bit of self-doubt or self-confidence starts shaking little in the exam, which is quite common for all of us, we will write wrong answer. Not lot of them who write wrong answer in the exam are bad students. Not a lot of them who write wrong answer in the exam are not prepared. Lot of them who are prepared end up writing wrong answer. Why? Because that exam hall know whatever efforts you put in the last 8 months, last 6 months, last 9 months, so many sleepless nights, so many hours in the class, so much of sacrifice that you've done in your life. All that is judged in 3 hours. 3 hours is what you have to write accounts paper, what you spend 200 hours in the class, 400, 500 hours at home, 700 hours of effort tested in 3 hours you write. They will check it in 15 minutes and tell whether you are a CA Inter student or again a CA Foundation student. Correct? No. So it's quite obvious to feel little overwhelmed, tensed, irritated, anxious, self-doubt. ಎಲ್ಲ ಬರುತ್ತೆ. ಕೈ ನಡುಗುತ್ತೆ, ಬೆವರು ಬರುತ್ತೆ. ಫ್ಯೂಚರ್ ಒಂದು ಸೆಕೆಂಡ್ ನಿಂಗೆ ರಪ್ಪ ಅದು ಪಾಸ್ ಆಗುತ್ತೆ. ಅಪ್ಪನ ಬೆಲ್ಟ್ ಕಾಣಿಸುತ್ತೆ, ಅಮ್ಮನ ಪೊರ್ಕೆ ಕಾಣಿಸುತ್ತೆ. All these tools and weapons will be visible in front of your eyes. Your bright future, your kids going to government school, your wife going in KSRTC bus because it is free. All that will flash in front of your eyes. Yeah. So if that is happening, the formula will forget. Format you will forget. So don't mug it up as a formula and format. Remember it as logic. Got this? Let's go to the next concept. How many of you got the same answer? Check your answers. If you got something wrong, correct what you went wrong with. Whatever you went wrong, you please correct. Done? Cool. Let's go to the next part. So after we discussed interest on drawings, the next thing that I want you to note is share of profit. How do we share the profit between the partners? In profit sharing ratio. Am I right? Usually it is shared between the partners in profit sharing ratio. And profit is distributed among the partners only after paying certain things. Only after paying what? Interest on capital, remuneration to partners, interest on advances given by partners, or any other payments to partners. After making any payments payable to partners, after collecting any receipts collectible from partners, whatever the profit that's still there in the books of accounts, that will be shared between partners. Do you agree with me? But you can promise some minimum guarantee to certain partners. You can promise some minimum guarantee to certain partners. Let's say after some years, when you start one partnership firm, you are like finally happy. Hey, I'm a chartered accountant today. I'm finally starting my firm. You start your firm. You give your first pitch of the deck to your client. This service I will offer. Client will ask, very nice. I'm impressed. How much experience do you have? You'll be like 1 year. No, one day. Yesterday I passed. Today I've started with. They're like, no, we want someone experienced. We won't give it to you. Yes, sorry. Now you're upset. Till now you thought passing the exam is the biggest thing in life. Now the moment you pass, they're like, you just passed. How can you handle my books? I won't trust. I won't give it to you. I'll give it to one old uncle. Now you are feeling devastated. So what do? You and your friend together will say, hey, remember that guy you took Foundation Marathon Revision? What's his name? You know it. Let's make him our partner. Like so that he is old now. Talel ಕೂದ್ಲಿಲ್ಲ ಕಣ್ಣಿಗೆ glasses ಇದೆ. He has one big belly. You get it? So now he's quite old. If we add him as a partner, then what will happen? We can also tell no. If he has 20 years experience, we can tell our firm is 20 years old. Then we can convince our clients and easily get the work. You will come to me and then ask, sir, please will you become partner? Why? Sir, our hard work, your experience. We will become rich. I'll be like, what if it become my hard work and your experience? What if we become poor? Your experience is zero. And at that age, I can't work hard. You can work hard, but you don't have experience. I cannot work hard, but I have experience. So you are counting on my experience, your hard work. Rich. What if it becomes your experience and my hard work? and we become poor. I'm like, at this age, I don't want to take so much of chance. I want some minimum guarantee. Whether you make profit or you make loss, I want minimum 1 lakh. I'm not telling I want 1 lakh. I'm telling you I want minimum. If you make more than that, if my share of profit comes to be more than that, I'll take profit. If it comes lesser than that, I want minimum 1 lakh. Sir, sorry, sir. Just example. For the sake of making you understand and keto nagaku reading. If me becoming bad helps you understand the concept, I am okay to become guaranteed partner. Who am I? Have been given guarantee. By whom? You. Who are you? Guaranteeing partner. Who are you? Who am I? I have been guaranteed with minimum payment. In our example, how much money did you guarantee me? 1 lakh. Whether you make profit or you make loss, how much money will I get? What if you make profit more than 1 lakh? For example, 1 is to 1 is to 1 is a profit sharing ratio. I, you, and your friend. You make profit of 3 lakh. 1 lakh nange, 1 lakh ninge, 1 lakh. It's okay. I am happy. What if you make profit of 3 lakh 60? Take 3 lakh 60 divided by 3. 1 lakh 20, 1 lakh 20, 1 lakh 20. Okay. What if we make profit of 1 lakh 50? 1 lakh 50 if we share, I'll get 50, you will get 50, she'll get 50, or somebody else will get 50. I'm like 50, I'm not okay. I want 1 lakh. I will take 25,000 from you, I'll take 25,000 from you. So I had 50 plus 25 plus 25. Now I have 1 lakh. You have 25, your friend has 25. Why did you both give? Because you are guaranteeing partners. Who am I? Guaranteed partner. There was a question on this last to last attempt or last attempt. I don't. I think last to last attempt in the examination. Yeah, very minute topic. People take lightly. Don't take lightly. So profit distribution in the case of insufficiency. But before we go to this profit distribution in the case of insufficiency, let's see one quick question on share of profit. Are you okay? So this is the question. So I want you to quickly click the picture of the question or whatever you want to do. Then we'll discuss the answer. Or people watching it recorded, what I would say is here again pause, see the question, solve it on your paper and then continue. Would you guys want to try? Okay. I hope people watching it online also, you took a pause and then you solved all 5 cases. Let's see the first case. Profit is 3 lakh. First, don't give 1 lakh to Nax, the guaranteed partner. 3 partners, Virat, AB, Nax. Who's the guaranteed partner? Nax. Who are the guaranteeing partners? Virat and AB. First, don't give the guaranteed partner minimum amount. No. First, distribute it in profit sharing ratio. What is PSR? 1 is to 1 is to 1. 3 lakh, you share it in 1 is to 1 is to 1 ratio. 1 lakh, 1 lakh, 1 lakh. How much is Nax getting? 1 lakh. How much is the guaranteed amount? Is he being paid guaranteed amount? That's it. That remains the answer. So in the first case, the answer is first share the profit between all 3 of them and then write minimum guarantee 1 lakh. Whichever is higher is 1 lakh. There is no extra amount needed to be paid. Final distribution is 1 lakh to Virat, 1 lakh to AB, 1 lakh to Nax. End of the answer. Let's make it interesting now. Go to case 2. In the case 2, how much is profit? 4 lakh 50. Don't give 1 lakh to Nax. No. What do? Always remember to first share it in the PSR. 4 lakh 50 into 1 by 3. 1 lakh 50 to Virat, 1 lakh 50 to Nax, 1 lakh 50 to AB. Now check, is Nax getting the minimum guaranteed amount of 1 lakh? Yes, leave them, no problem. I think these two would have done like this. The problem starts with the third one. When there is 1 lakh 80, you might have still got the answer right because I've kept the profit sharing ratio equal. If I play with the numbers, you'll get the wrong answer. I want you to approach it rightly. What should you do first? Don't give 1 lakh to Nax first and share 80,000 between Virat and AB. Wrong. First, share 1 lakh 80 between all the 3 partners in profit sharing ratio. 60, 60, 60. Got it? How much is Nax getting as share of profit? 60. What is the minimum guaranteed amount? 1 lakh. How much should he get additionally? 40. This 40 should be given by Virat and AB in equal ratio. 40,000 into 1 by 2. 20, 20. See in case 3. First you share them 1 lakh 80,000 in profit sharing ratio 1 is to 1 is to 1. 60, 60, 60. Nax is supposed to get 1 lakh, but he's got only 60. 40,000, whatever is supposed to be given to Nax additionally, will be taken from Virat and AB as 2020. So from Virat share you deduct 20, from AB share you deduct 20, their share will become 40, 40, and this guy's share will become 1 lakh. I think you got this also right. Have you? Very good. Look at case 4. What's happening in case 4? Profit is 1,80,000. Virat and AB are guaranteeing partners in 1:2 ratio. They can guarantee in their profit sharing ratio, or they can give guarantee in a different ratio also. Now 1,80,000 you share it between all three, Virat, AB and Nax, 1:1:1. 60,000, 60,000, 60,000. Got 60, 60, 60. Nax should get how much? Minimum 1 lakh. How much is shortage? 40. That 40 should be given by Virat and AB. They're telling that guarantee will be given in the ratio 1:2. So 40 into 1 by 3, 40 into 2 by 3. That is the amount to be deducted. 13,333 will be deducted from Virat's share. 26,667 will be deducted from AB's share. So Virat's share was 60. We deduct 13,333. We get 46,660. AB's share is 60,000. I deduct 26,667. I get 33,333. Next, 60,000 is his share of profit before, 40,000 is adjusted, 1 lakh will become. I hope you understood. Everybody? Yes. Then last one, case 5. Only Virat is the guaranteeing partner. So first 1,80,000 will be shared between all three of them. 60, 60, 60. Virat is supposed to give 40,000 additionally to Nax because Nax is the guaranteed partner. Virat is the guaranteeing partner. So you deduct 40 from Virat, you give that 40 to Nax. AB's share will remain 60. Nax share will become 1 lakh and Virat's share will become 20. I hope you understood this. Everybody? Pakka? There was a question on this in the past. There can be a question in the future, not a topic to be taken lightly. I hope you understood. After doing this part, the next thing that is to be done is profit in the case of insufficiency. Profit distribution in the case of insufficient. We have profit, but it is insufficient. The reason is we could not pay some item. See, profit is insufficient to pay interest on capital. How to deal in that case? I'll explain it to you. Observe. We have partners A and B. We have partners, focus only on the question. We have partners A and B. They are sharing profits and losses equally. How much is the capital? 2 lakh and 1 lakh. 2 lakh and interest on capital is how much? 10%. So how much interest should the firm pay? On 2 lakh partner A's capital, 10% is 20. On 1 lakh partner B's capital, 10% is 10,000. Can I say they have to pay 30,000 rupees interest? Their profit is only 15. From 15,000 net profit, can they pay 30,000 interest? So what do? In appropriation account only, how do you distribute that 15,000? In appropriation ratio. What is appropriation ratio? What is 2:1? Capital ratio. Why? Profit should be shared in profit sharing ratio. See, 15,000 is profit or not? Profit. Profit should be shared in what ratio? Profit sharing ratio. Now, 15,000 should be shared equally, no? 7,500, 7,500. Insufficiency. Does the partnership act says if it is insufficient, you share it in capital ratio? Then why? No, this has nothing to do with Garner versus Moret. No, just telling. Don't let her tell. She's telling only, hey, don't become Sonia Gandhi and make her become Rahul Gandhi. It's okay to tell wrong answer. Freedom of speech means freedom to be wrong also. It's okay. It's okay. Open your mouth. Tell. ಆಗಿದ್ರೆ ಇರಲಿ. I am not telling that A's interest on capital is more than B. Interest on capital totally to be paid by the firm is 30,000. To pay 30,000 interest on capital, I should have 30,000 profit. Let's say I have 50,000 rupees profit. What do? 30,000 I pay interest on capital. Remaining 20 will be shared between A and B, 10,000, 10,000 equally. I have 40,000 rupees profit. What do? 30,000 I give interest on capital. Remaining 10,000 will be shared between partners A and B, 5,000, 5,000. Now the profit is 15,000. Interest to be paid is 30,000. How do I pay 30,000 interest from 15,000 profit? I can't pay. I can't pay. 15,000 will remain profit. When I share this profit, I should not share it in profit sharing ratio. The reason is without paying interest on capital, you cannot share profit. Without paying interest on capital, you cannot share profit. So what do? You are paying interest but not completely because there is no sufficient profit. How much is the interest to be paid to partner A? 20. How much is the interest to be paid to partner B? 10,000. So 2:1 is the interest outstanding. We are supposed to pay 30,000. We have only 15. We have half the requirement. How much is needed? Money to pay interest. 30. How much money is needed to pay interest? 30. How much money is available? Okay, we have 50% money. How much should partner A be paid? 20. I'll give him 10,000. How much should partner B be paid as interest? 10,000. I'll pay him 5,000. That is 10,000 and 5,000. Are you getting it? Because we don't have full money, we pay it in the proportion of availability. Interest will be in the proportion of capital. So we take capital ratio. You understand why we take capital ratio? Tell me, why do we take capital ratio? This is because if the capital is high, interest is high. If the capital is less, interest is high. Interest is less. So the amount that we have is not sufficient to pay interest. So that to extent we have, we will pay it proportionately. When we share the profit now in capital ratio here, you are right, 2 by 3, 1 by 3. But when we share, we are not giving share of profit. What are we giving? We are paying interest on capital but not completely, proportionately. See, as profit is insufficient to pay interest on capital, profit will be distributed in capital ratio instead of profit sharing ratio. Logic being part payment of interest on capital, not profit distributed. I hope you got the logic. This is what I wanted you to know when we talk about introduction to partnership. I think we are good. You people have a fair understanding of what you should write in profit and loss adjustment account. Sorry, profit and loss appropriation account, and what payments to make in partners capital account. And if there are any errors in the process of preparation of partners capital account, please do rectify those errors and then go ahead. There are some questions where there are some errors in your partner's capital account or in the process of computation of profit before distribution. Please do those computations. By this we complete introduction to partnership. Let's now start with the next unit. This is about admission of a partner. How to do accounting when you admit a new partner into the firm. Admission, retirement, death, all of these are called as reconstitution of the partnership deed. Basically what's happening is there's one partnership deed which says that A and B are partners. When C becomes partner, in that partnership deed you need to write C's name also. You need to tell how much should be C's capital. You need to tell what is his profit sharing ratio, what is his interest on drawings, will he get any salary, what is his right, what is his responsibility, what if C gets married, what if C dies, what if C retires. All of that you would have to tell in the partnership deed except that marriage part. So when you have to mention all of this, you draft a new partnership deed. That is the reason it's called as reconstitution. I want you to have one idea in your mind whenever you do admission or retirement or death of a partner based questions. In the case of admission, two partners are running the show. When a third partner becomes a partner in the firm, this third partner is buying the share in the firm from the existing partners. Entire partnership is set up by two people. They bought every asset, they contributed every rupee. So when the new partner comes, he will buy share in every asset, every liability by giving money to the firm. So old partners are selling, new partner is buying. What? Share in the business. Share in the business. Are you getting it? So let's say two people are there. One vade is there. They're eating the vade. Both of them will get 50%, 50%. When new person comes, I also want vade. The two people who have the vade on the plate, they've paid money, no? So this new person should pay money to the existing two people and then buy it from him. So the other two partners who are giving the wedding, they're sacrificing a part of it. And the partner who's newly joining the team is buying it from them. This is what I want you to know. And why does the firm go into admission of a partner? Very simple. To increase capital, to increase managerial abilities, to increase to increase the scale of the operations and to do business at more than one location. This also brings in a lot of other problems. Are you getting it? So what is the perspective needed? Incoming partner is buying. Existing partners are, what are they buying? Business. So a part of the business is being sold by the existing partner to the incoming partner. When you are selling something, let's say you are selling your phone. I come to buy. What is the first question I'll ask? S2. How much? You will tell some value, no? Like that only. Let's say you and your friend have started one partnership firm quite long ago. I want to become partner in your firm. I will say I want to become partner. When I ask that I want to become partner, I will ask you how much is the value of your business. When I ask you how much value, you should tell one value, no? To tell that value, you will think what and all is there in your balance sheet, what and all is there in your liability side, what is there on your asset side, and all the items on asset side and liability side. You have written it at historical cost, what you paid long, long ago. Are you selling it today or are you selling it 5 years ago? Land in that balance sheet you bought 5 years ago. Machinery in that balance sheet you bought 6 years ago. Investment in that balance sheet was bought 10 years ago. When are you selling? Today. But items in the balance sheet are recorded at historical cost. So what do? You want to find the new value of business before you sell it to me. You want to find the new value of business before you sell it to me. So you do revaluation. Is there no value? No, there is a value. But you think that value is not correct. So you'll find the revaluation. Let's say you're selling me this office. This office belongs to you. This office belongs to you. If I ask you how much, will you look at your balance sheet, original cost minus depreciation, whatever value? Will you sell at that value? No. You will think today, if you sell each bench in the market, how much will you get? Each TV in the market, if you sell, how much do we get? What is the price of the fan? What is the price of the AC? What is the price of the land? What is the value of the building? You will take all of it together and then you will quote me the price. So in your balance sheet, bench is recorded at 2000 rupees. But you will check if this is sold separately, how much do we get? If you sell separately, if you're going to get 5000, will you collect from me 5 or 2? 5. So existing value in the balance sheet is 2. You will revalue it to 5. So what is revaluation? Already there is one value. You believe that that value is not correct. So you assign a new value to it. That is called as revaluation. You understand revaluation? What will you revalue? All the assets and all the liabilities of the firm. And all the assets and liabilities what you see is okay. Sometimes collectively they add some value. See, if you sell each bench individually, you might get 2000. If you sell the TV separately, you might get 10,000. AC separately might give you 15,000. And then that photographs or that electrical fitting separately 10,000. If you sell all of them separately, all the assets together might fetch you 6 lakh. But if you put all of the assets in this classroom together and then sell the classroom to me, together there is some synergy effect. Are you getting it? So together if you sell, and if I start classroom here, people will think it's you who's teaching and they'll come and sit in my class. Hard work is mine, no? Years and years of, sorry, hard work is yours, no? Years and years your thought here. So people come searching for you in your name. But when you come there, you're not there. So I get students to teach, but they've not come in search of me. They've come in search of you, but they learn from me. I make money. Yes. That money actually belongs to you. That money actually belongs to, let's say you are running one dosa shop from last 10 years. Your dosa is amazing. The dosa that you make is amazing. So what do people do? People come stand in the line and then buy dosa from you. Today I am buying your dosa shop. If I buy your dosa shop today, tomorrow people will come and then buy. But it's not you making dosa, it's me making dosa. They don't know. They still come. Bengaluru ಬೇರೆ ಕೆಲಸ ಇಲ್ಲ ದೋಸೆ ಅಂದ್ರೆ ಬಂದು ಕ್ಯೂ ನಿಂತ್ಕೊಂಡ್ಬಿಡ್ತಾರೆ. Yeah, I don't know how to make dosa as good as you, but still I'll make sales today. Why? People still come with an impression that it is you who's selling. Not just today, they'll come for next 2 years. It will take 2 years time for them to understand that this dosa is not the dosa that used to be before. After 2 years, people stop coming. After 2 years, if people still come, that is because my dosa is good. After 2 years, if I still have customers, that's because of me. For the first 2 years, it's because of you. So that first 2 years profit actually belongs to you. Are you getting it? So when you sell, you will charge me for the entire kitchen setup and you will collect the next 2 years profit that you expect to make from me immediately. That's goodwill. That's the reason I define goodwill as probability that the existing customer will stick to same business. That is the reason how do you compute goodwill? You will take the last 3-4 years profit, add them, divide by 3 years or 4 years, find average profit, multiplied by 3 years purchase, 2 years purchase. What is a 2 years purchase? For 2 years, customer will still come back to you and purchase goods from you. So you will sell, so you will make profit. That profit is already made mentally, though it will be earned physically later. That also you will add value of all the asset plus goodwill you will add. That is the money that I should give. But I'm not buying 100% of it. I'm buying 1/3 total business value into 1/3. That is the money that I bring in as capital. I should contribute 1/3 because I'll get profit 1/3 no later. If I'll get 1/3 profit in the future, I should contribute 1/3 of its value. That is the reason we do this adjustment. After I bring in money, we'll do capital computation of all of us and then finally prepare one group photo, balance sheet. Me with all our assets. Me and my two partners with all my assets and liabilities, one group photo. That's nothing but balance sheet after admission. You understood the basic flow? Very good. So in the case of ratios, there are three ratios that will compute: old ratio, new ratio, sacrifice ratio. Unless they ask a specific question only on computation of ratio, there is no need to do any ratio calculation. Unless they ask a separate question on ratio calculation, there is no need to compute any ratio. However, we'll spend a little time and then do a little bit of ratio. Shall we? Okay, try this question, find the answer. So the total firm's ratio should be taken as 1 by 1. This should be shared between Beam, Chutki and Raju. When Raju takes 1 by 3, 1 by 1 minus 1 by 3 will give you 2 by 3. Total firms ratio 1 by 1. In that cake, one circle is been cut into 3 parts. How many parts? 3 parts. How much did Raju take? 1 by 3. What will be remaining? 2 out of 3 pieces are remaining. The 2 out of 3 should be shared between Beam and Chutki. They share it in equal ratio, 1 by 2, 1 by 2. So you do 1 by 2 of 2 by 3, 1 by 2 of 2 by 3. They get 1 by 3, 1 by 3. So the new profit sharing ratio is 1 is to 1 is to 1. Sacrifice ratio, you can deduct how much was there, how much is there. If I had this much, if I have only this much, difference is what I gave you. Morning I had 10 rupees with me, now I have 8 rupees with me. How much did I give? 2. Like that, how much I had minus how much I have now. If you identify, that will become how much I gave. Identify that for both the old partners. You can identify their sacrifice ratio. Quite easy. Sacrifice ratio. But actually in the big problems, no, computation of these ratios are not needed. You can solve all the big problems without computing ratios. Why? Very simple. Don't compute sacrifice ratio, don't compute gain ratio, don't compute closing ratio. Opening and closing will be given. Straight away apply the ratio with goodwill amount, or straight away apply the ratio on the profit amount. Between amounts you see difference. Don't see the difference between ratios. Fractions are difficult to add and deduct. Amounts are easy to add and deduct. So try and deal with amount, not deal with fractions. We've done that in one of the papers that we done. So anyways, you can see the problem practice video. In that you will get to see whenever we do partnership based questions, how do we deal with ratios. Come on, I will give you only one more. Try this one more. I want you to put full focus and energy on the word from. What is I told here? Beam and Chutki are in partnership, sharing profits and losses in the ratio 2 is to 3. Raju is admitted into the firm. He gets 1/6 from Beam, 1/3 from Chutki. So when they tell the word from, you should deduct from Beam's share of 2 by 5, deduct 1 by 6, which is given to Raju. From Chutki's share of 3 by 5, deduct 1 by 3, which will be given to Raju. If you deduct that, you will find Beam and Chutki's new share. Observe. So what is Beam share? 2 by 5. Chutki's share 3 by 5. In that 2 by 5, Beam is giving 1 by 6 to Raju, no? From 2 by 5, you deduct 1 by 6. And Chutki also. From 3 by 5, you deduct 1 by 3. Whatever remains is Beam and Chutki's new ratio. And how about Raju? Raju gets 1 by 6 from Beam, 1 by 3 from Chutki. So 1 by 6 plus 1 by 3. That will become Raju's share. I hope you got it. What is the key word here? From. When they use the word from, directly deduct. Directly deduct. Are you getting it? What if they play and instead of the word from, they use the word of? First you should multiply and then you should deduct. What should you do? Now Raju is admitted into the firm and he gets 1 by 2 of Beam's share. He'll get to 2 by 3 of Chutki's share. What to do in that case? Of the Beam share 2 by 5, first multiply 1 by 2. What would he get? He would get 1 by 5. So 1 by 5 Raju gets from Beam. And Chutki had 3 by 5. Raju is going to get 2 by 3 of Chutki. So multiply 2 by 3 into 3 by 5. Whatever 2 by 5 you get, no, that of Chutki will belong to Raju. So Raju will get 1 by 5 of Beam, 2 by 5 of Chutki. The previous question they straight away given 1 by 5, 2 by 5. We just added. Here we had to find what do they get and then add. Now add 1 by 5 and 2 by 5, you get Raju's share. After deducting this 1 by 5, 2 by 5, what we computed, you will get Beam and Chutki's new share. This is the answer. I hope you guys have got it. Say something. Have you got it? Pakka. Can I go forward? What's after this that I want you to note? After this, I have a small learning for you. I want you to know that when nothing is mentioned, opening ratio and sacrifice ratio are same. When they use the word from, directly deduct. When they use the word of, multiply and then deduct. I'll repeat. When they give no information, opening is equal to sacrifice. When they mention the word from, directly deduct. When they mention the word of, multiply and then deduct. I hope you got it. Something. Next, what we have, revaluation of assets and liabilities. I told you assets have to be revalued. Revaluation means giving the new value. The new value can be more, new value can be less. If the new value is more, asset account debit to revaluation. If the new value is less, revaluation account debit to asset to increase or decrease the value of the asset. With regard to liability, if the value of the liability has to be increased, liability has to be credited, debiting revaluation. If the value of the liability has to be decreased, liability will be debited by crediting revaluation. Any profit or any loss, any income or any expense arising in the process of revaluation, arising in the process of admission, retirement, death has to be routed through revaluation account. You cannot write it to P&L. I hope you got it. Increase in the asset or decrease in the liability is profit. Decrease in the asset or increase in the liability is loss. If there is an unrecorded asset or an unrecorded liability, remember that asset which is unrecorded is actually recorded at 0 rupees. And now you are assigning a new value which is nothing but increase in the value and profit. Unrecorded liability is like liability is recorded at 0. Now you are assigning a new value. Increase in the liability will be regarded as loss. You won't identify individual revaluation profits and individual revaluation losses. All the revaluation profits and losses will be written in a ledger called revaluation account, which looks like this, where the credit side represents profit, that is increase in the value of the asset or decrease in the value of liability. Debit side represents loss, that is decrease in the value of the asset or increase in the value of liability. Net amount of revaluation profit or loss is determined and this will be transferred only to old partners in the old profit sharing ratio. Why? Because if the asset of land was bought at rupees 1 lakh 5 years ago, today if it has become 10 lakh, that 1 lakh to 10 lakh increase is there, no 9 lakh journey. Who are the partners? Only old partners. The new partner comes in today. So the new partner here, value of the land will be 10. To old partners should assign that 9 lakh rupees profit in the profit sharing ratio. I hope you understood. Sometimes in the question, they might mention that doing this revaluation is leading to restatement of the value of the asset, which they don't want to do. They want to record the assets at its original cost. If they want to record the assets at its original cost, then the revaluation impact has to be nullified. How do we do this? This is done by way of an account called as Memorandum Revaluation Account. I'll tell you what is the problem with revaluation account. We are recording the assets at its market price. We are pre-booking the profit even before selling. That is against conservative approach. So what to do? This problem replicates in your balance sheet also. Assets will be shown at higher value. We don't want to do this. We want to show the assets at original cost, but we still want to book profit. So what do? We do memorandum revaluation. How is memorandum revaluation done? Very simple. Whatever impact you give in revaluation will be reversed. So if you prepare a memorandum revaluation, at the end assets will go to original cost. For example, observe, you have increased the value of the asset, you wrote credit here. You decrease the value of the asset, you wrote debit here in revaluation. You increase the liability, you wrote here. You decrease the liability, sorry, you decrease the liability, you have written on the credit side, income. You have increased the liability, expense, you have written here. Because of that, you get profit or loss, revaluation profit, shared to partners in profit sharing ratio. You reverse the impact by rating the debit items on the credit side, credit items on the debit side. If a value of an asset 1 lakh is revalued upward by 10, you would have written 10,000 here. This will be reversed by writing 10,000 here. If in case you reduce the value of an asset by 2,000 by debiting in revaluation, it will be reversed by writing it here. By this, you know what will happen? Whatever we got as revaluation profit here as balance and figure will be arrived here as memorandum revaluation reversal of revaluation profit, like basically loss. When we share this profit to all the old partners in old profit sharing ratio, this profit will be shared to new partners in new profit sharing ratio. The net impact of this is something very simple. The profit should be given to old partners, but without changing the asset. How? Who will give? the incoming partner. Who will give? The incoming partner. Just to give you example, let's say 12,000 is revaluation profit. How much is profit? 12,000. A, B, C are partners. A and B old partners, C incoming partner. How do you share 12,000 between A and B old partners? 6,000, 6,000. Old partners 6,000, 6,000. Equal ratio. When you come here, reversal, you will share 12,000 to three partners A, B, and C. 4, 4, 4. Here it is loss, it will be debited to capital. Here it will be profit credited to partner's capital. Are you getting it? Let's say you admit the partner. You admit the partner. Then if you actually book profit, 12,000 profit will be given to partner C to whom it doesn't belong. 12 in our example. 4,000 profit will go to C who doesn't actually have a right in it. It should be 6 to A, 6 to B, no. But if you do it after A, B, C, you will get 4, 4, 4. A and B is getting 2,000 less. C is getting 4,000. So C will be debited by giving 2,000 to A, 2,000 to B at the time of admission only. So that at the end, if C gets 6,000, in that 2,000 is already given to A and B. So his share will be 4. So his share of 4 will be already adjusted. Are you getting it? Say something. So it's nothing but the profit of the continuing partners compensated by the incoming partners in the sacrifice ratio. Do this memorandum revaluation account in two cases. One, when they openly ask you to do memorandum revaluation. Two, when they tell the partnership firm want to show the assets in the balance sheet at original cost. The partnership firm want to show the assets in the balance sheet at original cost. If they want to show it at original cost, revaluation should not be done. So whatever revaluation is done is reversed. And then that reversal of loss will be shared to all the continuing partners in new profit sharing ratio. I hope you understood this. Very good. And goodwill. What will happen to goodwill on admission of a partner? What will happen to the goodwill of the firm on admission of a partner? I'll give you options. Option A, increase. Option B, decrease. Option C, nothing. Option D, can't say. Or option D, la. Only three. Increase, decrease, and doesn't change. It doesn't change. Sir, but new partner brings in goodwill. New partner doesn't bring goodwill. He purchases the goodwill of the firm. The goodwill is there in the firm. The new partner buys it, it will stay in the firm only. Goodwill is like an asset. This asset belongs to A and B old partners. Now when new partner comes in C, this asset belongs to A, B and C. Let's say this asset is 90 rupees. What is the value of this asset? A 45, B 45. Now when C comes, this belongs to all three. 90 when you share between all three, it will become 30, 30, 30. C is getting 30 rupees worth of asset. C should give 30 rupees cash. In that, 15 rupees belongs to A, 15 rupees belongs to B. Why? A share was 45. Now A share reduced to 30. How? 15,000 you should receive cash. B share was 45. Now B share will reduce to 30. So B should receive 15 rupees cash. C is gaining, no? 30. So C should bring 30 rupees cash. In that 15 goes to A, 15 goes to B. If they want, they can withdraw it in cash. If not, they will not withdraw in cash. But we will increase their capital and then tell them whenever you want, you can withdraw. That is goodwill adjustment. Very, very important point to note. Don't ever tell me that on admission, the goodwill of the partnership will increase. No, goodwill will not increase on admission. Goodwill of the firm is because of the old partners. This asset is the effort of the old partners. The new partner wants to enjoy. If he wants to enjoy the asset, he has to buy. In order to buy, he has to pay money. Whom should he pay to? He should pay to the people who own it. You want to come, you want to buy my phone, so you should give me money. You should give money to whom? Me. That is also an asset. Goodwill, you pay money to the people who own it and then enjoy it. Are you getting it? This imaginary goodwill, whatever you compute, profits added divided by number of 3 multiplied by number of years purchase, it is a raised goodwill. It is not a goodwill as per accounting standard 26 intangible assets. It cannot be written in balance sheet asset side. Sir, when do we write it on the balance sheet asset side? Only and only when you buy. Only and only when you buy. Are you getting it? We'll do solution. If you see the problem practice, you'll understand. We've done in our June 24 paper. So please do check that. I've taught you how to do goodwill analysis using a table. Are you getting it? Now, I want you to understand the hidden goodwill based problem. Here, the details of goodwill is not given openly, but there is goodwill inside. I want you to compute this. Try. Tell me how much is the value of goodwill. How do we find goodwill in this? A and B's capital is 30 and 30. Can I say their capital is 60? C is coming in as a partner to buy how much share? One third share. Am I right? If C is paying one third share, 50,000. There is one cake which is cut into three parts. C is getting one piece out of three pieces, or that one piece out of three. How much money is C paying? For one out of three pieces, how much is the money C paying? For one piece, if he pays 50,000, what will be the cost of the entire cake? 1 lakh 50. What will be the value of the entire cake? 1 lakh 50. But what is the value of the cake? A's share is 30, B's share is 30, C's share is 50. Add 30 plus 30 plus 50. 110. Deduct that amount that we found, 1 lakh 50. 40,000 is good. Did you understand? So C is capital one third. For that, if it is 50,000, what is the value of the entire firm's share? 1 lakh 50. But the capital contributed are 30, 30, 50. 1 lakh 10. Difference of 40,000 is the hidden goodwill. They have not told goodwill, but they have collected extra money from C. How much extra? Towards his share of goodwill. Are you getting it? Say something. Can this kind of question come? Yes. And methods of computing goodwill. How many methods do we have? 4. Average method, super profit method, capitalization method, annuity method. Average profit method has two separate methods. One, simple average, two, weighted average. One, simple average, two, weighted average. When do we follow simple average? When do we follow weighted average? Sir, if the question says simple average, simple average. If the question says weighted average, weighted average. When does the question say weighted average? If it follows trend, it doesn't matter increase, decrease. If the profits follow a specific trend, so if there is one sequence, you see sequence and series no in your QA like that. If there is some sequence, if there is some pattern, you follow weighted average. What if there is no specific pattern? It's random episode. Sometimes up, sometimes down, sometimes same, sometimes less. There's no pattern. Then we apply simple average. When do we apply weighted average? When there is a pattern. When do we apply simple average? When there is no pattern. How do we compute goodwill under average profit method? We do adjusted average profit multiplied by number of years purchase. What do we do? Adjusted average profit multiplied by number of years. What is adjusted average profit? There's another name. Future maintainable profit. What is it? Future maintainable profit. The profit that is there in the firm, which they will earn in the future, multiplied by number of years for which they can maintain such profit, even with change in management, change in ownership, selling it to somebody else. That's goodwill. I gave you example. No, what is goodwill? Probability that the existing customer will stick to same business. For how many years will people come back and purchase goods from you in the future? That many years it is goodwill. Are you getting it? Say something. Let's quickly see one question. Okay, come on, solve this. Identify the goodwill. Let's see. Can I see the profits for the last 3 years are 18, 19, 19, 20, 20, 21, 1 lakh 80 and 1 lakh 20. But I should find the adjusted average profit. Observe, profits for 18, 19 included lottery income of 5,000. You tell me 18, 19, 1 lakh includes 5,000 lottery. We win lottery every year. That lottery income is included in 1 lakh. Eliminate that lottery income first. So the profit for 18, 19 to be considered is 95. And they've told 2021 is after providing loss for fire 10,000. In 2021, 1 lakh 20 is there, no, that is after deducting loss because of fire 10,000. Loss will happen every year because of fire. 1 year you forgot to turn off the gas and then you put the diya and then fire happened. That will not happen every year. Are you getting it? So that loss is already deducted. Add. What do you get? Profit in year 2021. 100 and sorry 1 lakh 30,000. So adjusted profits are actually 95, 80 and 1 lakh 30. Take the adjustments, take the adjusted profits, then you total them and then you take the average. What is the average? Adjusted average profit? 1 lakh 1,667. This you multiply with number of years purchase mentioned in the question, 2 years. Then you will get 2 lakh 3,330, 33.333. You got this? Whenever they follow any specific trend, apply weighted average. For example, see here 1 lakh, 1 lakh 20, 1 lakh 40. So 1 lakh, 1 lakh 20, 1 lakh 40. There is a trend. There is a trend pattern. So in this case, question also tells that apply for weights. What weights? 1, 2, 3. So we'll apply weights. So profit 1 lakh, 1 lakh 20, 1 lakh 40. I'll apply weight as 1, 2, 3. 1 lakh into 1 lakh, 1 lakh 20 into 2, 1 lakh 40 into 3. You'll get the values, total them, that's the weighted average, weighted profits. Weight will be 3 plus 2 plus 1, 6. Divide 7 lakh 60 by 6, you will get 1 lakh 26,667. I hope you understood. This is how you find goodwill under weighted average profit method. How about super profit method? What is super profit method? What is the logic behind super profit method? Don't mug it up as a formula. Don't mug it up as a formula. You will compare yourself with everybody else in the industry and then see how much profit can you earn more than others. Let's say I earned profit of 12,000. I earned profit of, everyone else in the industry earned profit of 10,000. Did I earn more than them? Yes. How much did I earn? 12. How much did I earn? How much did everybody earn? 10. I cannot say full 12,000 of my profit into number of years purchase is goodwill. Wrong. Anyone who starts business can earn money. Anyone who starts dosa shop in Bangalore will sell. You don't have to make really good dosa. Are you getting it? First time everybody will buy. Second time they'll not come. But one time sale is possible. One time sale is. Are you getting what I'm trying to tell? So to sell again, you need goodwill. To sell once, you don't need goodwill. If I make 12,000 profit, if everybody else makes 10,000 profit, my super profit earning capability is 2,000. How much did I earn extra over and above everyone? 2. That 2 multiplied by number of years purchase will give me goodwill. Everybody is earning 10,000. That is normal profit. Everybody is earning how much? 10. What is it? What is it? Normal profit. What is the 10,000 that everybody earns? Normal profit. How much did I earn? How much did I earn? How much did I earn more than them? The 2,000 will become super profit. How do we find super profit? Actual adjusted average profit minus normal profit. Normally everybody earns 10. I earned 12. I earned extra 2. That extra will make me super profit. Everybody will jump 2 meters. Everybody will jump. Superman will jump 10 meters. Superman's jump of 2 meters is not super. That extra 8 meters will make it super. Are you getting it? Everybody can jump 2. Superman jumped 8 or 10. That extra 8 meters is super part. First 2 meters is man. Next 8 meters is super. Like that only. First 10,000 he will also earn, I will also earn. That extra 2,000 is called super profit. That super profit will be multiplied with number of years purchase. What is number of years purchase? Number of years for which my customers will come back and purchase goods from me. Number of years for which I can sell goods extra to my customer. Make that extra profit. That becomes my super profit. That super profit multiplied by number of years purchase is goodwill under super profit method. Say something fantastic. How do we find our goodwill? Super profit multiplied by number of years purchase. How do we find super profit? Adjusted average profit minus normal profit. My profit of 12 I can compute. How can I compute someone else's profit 10,000? It depends upon capital that I start with. How much capital did I start with? Let's say I started with 1 lakh capital. How much capital did I start with? 1 lakh. In the market, normally people earn 10%. In the market, normally people earn 10%. If I would have given my 1 lakh capital to anybody else, how much they would have earned? How much would have they earned? 10%. 10% of 1 lakh is how much? Can I say they would have earned 10,000? Can I say they would have earned 10,000? On 1 lakh, how much did I earn? 12,000. So they earned 10,000. I earned 12,000. Difference of 2,000 profit. Super profit. Multiplied by number of years purchase. Good. I hope you got it. I will take my capital. I will take my actual capital multiplied by the normal rate of return. I will get the normal capital what everybody will earn. I will compare it with my actual profit. If I want more, super profit. Multiply with number of years purchase. Goodwill. Are you getting it? I want you to solve this question. 1 lakh. What is it? Goodwill. Everybody? Okay, let's see. What is my capital? 10 lakh. What is the normal rate of return? So do 10 lakh into 6%. 60,000 is a normal profit everybody will earn. 60,000 is a normal profit everybody will. How much profit will I earn? 1 lakh plus 1 lakh 20 plus 1 lakh 40 divided by 3. 1 lakh 20 is my average profit. How much will everybody earn? 60,000. How much did I earn? 1 lakh 20. How much did I earn extra? Super profit. 60 multiplied by number of years purchased 2. 1 lakh 20. That becomes my goodwill. Are you getting it? Goodwill is super profit multiplied by number of years purchased. Super profit is actual profit minus normal profit. Normal profit is actual capital employed multiplied by NRR. Normal capital 10 lakh. NRR 6%. Normal profit 60,000. That 60,000 I deducted from my actual profit of 1 lakh 20. Average profit. 60,000 became super profit multiplied by 2 years purchase. I get goodwill as 1 lakh 20. You understood the computation of goodwill here? Fantastic. Capitalization method. Under capitalization method, one more accounting estimate is fixed. Now, super profit method is better than average profit method. Do you agree with me? But there's a problem with super profit method. After you find super profit, you are multiplying it with number of years purchase. That's an accounting estimate. How can you tell customers will come back to your shop for 3 years? How can you tell the customer will come back to your shop for 2 years? How did you arrive at that number? 3, 2, 1. How did you arrive? Is there a basis? No basis. Is there any basis? Without any basis, you are telling one number, which I don't believe to be right. So what do we do? So we switch to capitalization. Everybody in the market is earning 10,000 rupees. Everybody in the market is earning 10,000 rupees. To earn 10,000 rupees profit, what is the normal rate of return? 10%. Let's say how much is the normal rate of return? 10%. To earn a 10%, 10,000 rupees, how much should be the capital? 1 lakh. But I've invested only 80. That extra 20 what I've not invested is my goodwill. So in super profit method, what do you compare? Profits. In capitalization method, what do you compare? Capital. Are you getting it? How much profit did I earn? Let's say I earned profit of 10,000. How much profit did I earn? I ask in the market, what is your normal rate of return? They say 10%. So to earn 10,000 at 10%, how much capital should I invest? 1 lakh. I will check how much capital I've invested. If I've invested only 90,000, 10,000 is good. If I invested 85,000, 15,000 is good. Are you getting it? So I'm comparing normal capital with actual capital. I'm comparing normal capital with actual capital. In the example, normal capital is 1 lakh. Actual capital is 85,000, 90,000, all that. How much capital I should have invested minus how much capital have I invested. Difference will become goodwill. How do I find normal capital? Very simple. Adjusted average profit divided by normal rate of return. I want you to see this formula. I want you to try and compute the value of goodwill. Check. Tell me what do you get? Everybody try. Did you try? Can I take the calculation now? Okay, help me. How much is the profit that I earned? 6,000. What is the market rate of return? If I also earn at 6% and my profit is 6,000, how much should have been my capital? Normal capital. What is normal capital? Adjusted average profit of 6,000 divided by normal rate of return 6%. 6,000 by 6%. 1 lakh should have been my capital. My capital is only 80,000. 20,000 what I have not invested will become my. I hope you understood. Lastly, we have annuity method. Under annuity method, they will only tell is it based on super profit or is it based on adjusted average profit. On that profit, you multiply the annuity factor what is given, you will end up finding the goodwill under annuity method. Understood? And once this is computed, you can do simple computation of your entire business entities admission of a partner accounting. All you would have to do is you would have to first prepare profit and sorry you would have to first prepare revaluation account, identify profit or loss, share it to partners, old partners in profit sharing ratio, recompute their capitals. I taught you how to do goodwill adjustment. Once you recompute the goodwill and then adjust it through the partners capital account, prepare balance sheet. Same works in admission, same works in retirement. Logic is opposite of each other. In admission, one new partner is coming in. This new partner coming in is buying the share. In retirement, one partner is going out. He is selling his share to the existing two partners. In admission, one partner who is coming in is buying. In retirement, one partner who is going out is selling his share to the existing partners. I hope you understood admission. I hope you understood the change in admission and retirement logic. Death of a partner is different. Death of a partner is different from admission and retirement. And I think JLP part, should we be discussing it separately now, or JLP? Okay, can we do one thing? We'll finish death of a partner and then come to JLP. Yes, come on. Let's finish death of a partner and then discuss JLP once for all. And when we do dissolution, we need to discuss dissolution's JLP treatment separately. Focus. So death of a partner is different from retirement. Why? Retirement is planned, death is not. You can tell a partner retire on 31st of March. Can you tell a partner die on 31st March? You can die some random day. Retirement, because it is planned, you compute profit till that date, you compute interest till that date, you compute salary till that date. Death will happen on a random date. You would have to compute interest on capital, interest on drawing, salary, share of profit, everything till the date of death of a partner. Interest is simple, salary is simple, number of days, time wise. Profit is where it will all become complicated. How do you identify profit? By preparing P&L. P&L is usually prepared at the end of the year. Now, when the partner dies on 1st of January, we need to prepare P&L on 1st of January. We need to identify closing stock on 1st of January. We need to book all the expenses till 1st of January. This is irritating. There is difficulty in doing it. 31st of March itself, you could not find inventory. You did 15th April, 25th March, and you did so much of gambling. PRS you had to do to identify adjustments to rectification. It's too much time taking to do balance sheet on more than one day. So what does the firm do? Firm will arrive at some estimate. Last 2 years profits, last 3 years profits they will take, and they'll arrive at one estimate. Average of last 3 years. You add the profit of last 3 years, divide it by 3, you will get average profit of the firm. Multiply it with number of months for which the partner was alive in this period. You will get the average profit. On that you apply his share, you give him the share of profit without computing the actual. So share of profit will be usually estimate. Usually, are you getting it? Very good. Now, this share of profit till the date of that is usually determined before the end of the year. So, any amount that is computed and given to the deceased partner will be given out of P&L adjustment account, not in P&L account. It will be given out of P&L adjustment account, not from P&L account. At the end of the year, when you compute the actual profit of the firm, from that deduct that money which is already given to the deceased partner on estimate. Balance will be shared by the continuing partners. Are you getting it? Balance will be shared by the continuing. That estimation, whatever is done, can be the amount given in the question, or they can ask us to compute. If they ask us to compute, there are two bases. One, based on turnover. Two, based on time. One, based on turnover. Two, based on time. I'll show a question to you. I want you to try and estimate the profit for the firm till the date of death of the partner to be given to them. To do this, I'll be back in 2 minutes. Okay. I told you till the date of death you would have to compute the profit, but it's slightly complicated to find the profit by P&L preparation. So we do it on estimated basis. In the first case, when they tell turnover basis, how much turnover was made in this year, how much turnover was made in last year, how much profit was made last year. Using that comparison, we find the profit till the date of death. How much was the sales in last year? 12 lakh. How much is the profit? 6 lakh. How much is the turnover in this year? 4 lakh. For 12 lakh sales, if you made 6 lakh profit, for 4 lakh sales, how much profit will you make? Simple. 6 lakh into 4 lakh divided by 12 lakh. 2 lakh will become the profit till the date of death. This is not the profit share to the deceased partner. This is the profit of the firm. This is the profit of the, what is this ratio? Share. Partner C who got killed, sorry, partner C who died. 1 by 6. 1 by 2 lakh into 1 by 6. 33,333. Understood? Next, we'll make it slightly different. Second basis is time basis. When did partner C die? 1st of July. So he was alive in April, he was alive in May, he was alive in June. How many months was he alive? 3 months. For 12 months, firm has made profit of 6 lakh. For 3 months in the current year where he is alive, how much profit would have they made? 6 lakh into 3 divided by 12. For 12 months it is 6 lakh. For 3 months it is 1 lakh 15. 1,50,000 is the profit of the firm, not of the deceased partner. Deceased partner share is found as 1,50,000 into 1 by 6. That comes to 25,000. I hope everybody understood. Make some noise. Very good. Then we'll bring to the last part of death of a partner. This is section 37 of Partnership Act 1930. This was added to ensure that the deceased partner is gone. The dependents of the deceased partner are not abused by the firm. When A, B, C and there, C knows how to talk with A and B. C knows how to collect money. C will collect the money. C will take care of the spouse and children. C will take care of the parents. If C dies, what if the dependents of C don't understand numbers very clearly? What if A and B starts abusing C's dependents? Don't give them the money that they should get because of C. If C is alive, C would have taken everything that belongs to him, given it to him. Suddenly, if he dies, then what if A and B cheats? To ensure that the user, how to say, the dependents of C are not cheated, this section comes. It says that immediately on the death of C, partnership firms partners A and B should compute the amount that belongs to C and share it to deceased partners' dependents. Are you getting it? If they don't give immediately, they should agree at something. They should tell the deceased dependents are there, no dependents of C. They should tell them, how am I going to pay? I am also having little crunch in capital. So whatever the money that we should have paid, which belongs to C, I will give 50% today. Balance 50% will be given after 3 years. For 3 years, I'll give you interest. They should tell. Or I don't know how, but I'll still give you full money now only to take. You're already in emotional loss. I don't want you to have financial difficulty also. Take this money, they should give. Or they'll tell, I don't have any money. Death of this C will lead to death of me because I am overly dependent on this partner. We can't give you money immediately. We will give it to you after 3 years. Till then, we will give you this much interest. We should agree upon something. If they don't agree upon anything, if they don't settle, if there is no agreement, then the dependents of the deceased partners are entitled to most advantageous option among two. What are the most advantageous options? Number one, share in the profit as if C was a partner. Share in the profit as if C was a, in what proportion? In the proportion of the capital to the extent that belongs to C with the total capital of the firm, or interest at 6%, whichever is beneficial to them. Let's say partner C's capital is 1 lakh, but adding all that reserve, interest on drawing, share of profit, and reserve, everything together, it comes to 1 lakh 50. Revaluation profit, everything, it comes to 1 lakh 50. Total capital of the firm B and A and B who are continuing is 1 lakh 1 lakh. So 1 lakh 50 C's share on the top divided by total 1 lakh A, 1 lakh B, 1 lakh 50 C, 3 lakh 50 in denominator, multiplied by profit made during the year. Proportionate share in the firm's profit, that proportion is capital of firm, denominator share of C in the capital, or amount to be paid to C's deceased dependents on the numerator. In that proportion, share of profit, or interest at 6%, whichever is higher, whichever is more beneficial will be given to them. I hope you got it. So this is what we should know in the case of death. In the case of death of a partner, there is a question on rectification of errors with death of a partner. That's one question that I would want you to do. Z, car, I don't think you would have forgotten this if you would have done ever. So please do this question. If in case you don't, in our study material it is question number 44 or 45, I don't know. 40, no, 45. Home and company question. Do this same question is there in ICAI study material also. If in case you get stuck, you please ask. I'll share solution to this question. This one question mandatory to do without fail. Please do this rectification based question in death. By this we're done with death of a partner. That brings us to dissolution of partnership. Let's discuss joint life policy treatment in admission, retirement, and death before we take up our dissolution discussion. The concept of joint life policy is the policy taken on the lives of all the partners together by the firm. Here, the person who's going to get the benefit is firm. The person who's going to pay the premium expense is firm, because the dependent on the partner here is firm. If a partner dies, the firm has to give the deceased partners or retired partners capital in the firm, interest till the date of retirement or death, and then share in profit, interest on capital, salary remuneration, revaluation profit or loss, share in reserves, several things. If so much money is given out from the firm to the partner, no, this will not be called as death of a partner. This will not be called as retirement of a partner. It will eventually become dissolution of firm because there is no money in the firm. We don't want this to happen. So what does the firm do? To safeguard the interest of the firm will take one insurance policy on the partner. Here, who pays the premium? Firm. If the partner dies, who get the policy money from the insurance company? Firm. It doesn't belong to partner. It belongs to firm. Because what belongs to the firm belongs to the partner, that will be later shared among all the partners. And there are a couple of points where people usually get confused because of the incorrect understanding. We'll try and see. If you understood incorrectly, we'll sort it. If you understood correctly, good, no problem. If you have any doubts, we'll solve it in this GLP part. So if any partner dies or retires, then the policy will lapse and we receive the money. Whenever we are receiving the money, the company, the insurance company will give us the money dependent upon two things. One, did the policy mature or is the policy surrender? Did the policy mature or did the policy surrender? If the partner retires, the policy is surrendered. If the partner dies, the policy matures. If the policy, sorry, if the partner retires, the policy is surrendered. If the partner dies, then the policy is mature. On maturity of the policy, we receive the entire sum assured. On surrendering the policy, we only receive part of the premium that we have paid. Are you getting it? Read this. It is insurance policy that we take on our lives. Firm pays the premium to insurance company provided periodically. On death of the partner, firm receives sum assured, that is policy amount. On retirement of any partner, firm receives surrender value from insurance company. I hope you got this. We have certain terms that we should know when we deal with JLP. First one, premium. What is premium? Premium is the money paid by the firm to the insurance company. What is sum assured or policy amount? This is the money paid by the insurance company to the firm if the partner dies, and surrender value. This is also the money that the insurance company will pay to the firm, not when the partner dies, but when the policy is surrendered. But when the policy is, I hope you understood all these three terms. Very good. And if in case the partner dies and the money is received by the firm, that money received on the death of a partner does not belong to the deceased partner. It belongs to firm. Entire amount will be shared between the partners in PSR. I hope you got it. Let's address this. Come on. We'll see a couple of small points. See here. Tolu, Bolu and Kalia are three partners. And this is the policy amount. This is the surrender value. Okay. And how much money will we receive if Tolu dies? If Dolu dies, what will happen? Dolu's policy will mature. Bolu and Kalia's policy will be surrendered. If Dolu dies, only Dolu's policy will mature. Bolu and Kalia's policy will not mature. So Dolu's policy amount of 1 lakh will be received. On Bolu and Kalia, we won't receive policy amount. Instead, we receive surrender value of 10 and 10. So totally the firm receives so much. 1 lakh rupees on maturity of Dolu's policy, 10,000 on surrendering Bolu's policy, 10,000 on surrendering Khalia's policy. Together the firm receives 1 lakh 20. Don't tell 1 lakh belongs to Dolu, 10 and 10 belongs to Bolu and Khalia. No. Entire 1 lakh 20 belongs to the firm. 1 lakh 20 will be shared between the partners in their profit sharing ratio. What is the profit sharing ratio? 1 is to 1 is to 1. So they get 40, 40, 40. Are you getting it? But that money 1 lakh 20 received in cash, that cash will be used to pay the deceased partner, but the money belongs to the firm. The profit will be shared between partners in PSR. Are you getting it? So it's never like the deceased partner's maturity amount belongs to deceased partner. No, policy is taken by the firm. Money belongs to the firm. Profit will be shared between partners in PSR. Money received from insurance company will be used to pay deceased partner. I hope you understood. Anybody has doubt with this? Okay. Journal entry. When you receive the policy money, cash account debit to GLP 120, 120. That 120 will be shared between partners 40, 40, 40. This cash will be used to pay Dolu's capital. You will write Dolu's capital to cash. Cash that I have plus the cash I received on GLP together will be paid. Are you getting it? See, how much money will the firm receive if Dolu retires in the first case? See, when the Dolu die, policy will mature. If the Dolu retires, then the policy is surrendered. For Dolu's policy, we receive for a surrender value 10. Bolu and Kali also we received 10, 10. So totally we received 30. 30 belongs to the firm, shared in the ratio 10 is to 10,000, 10,000, 10,000. If you have to write accounting entry, cash to JLP for money received, JLP to partners capital account for money. I hope you understood this. Yeah, see JLP premium whatever we pay can be treated in two ways in the firm's books. Premium whatever you pay can be treated in two ways in the firm's book. First one, it can be written as expense. Second one, it can be recorded as asset. Sir, why is it asset? Isn't it expense? Expense, you know, premium paid is expense. Expense to cash, P&L to expense. Why am I calling it asset? Very simple. Every month I pay, or let's say every year I pay 10,000 as JLP. Every year I pay 10,000 as JLP. What you are doing is every year 10,000 you go on rating to P&L account expense, 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 expense. 5 years you paid 10,000, or let's say 4 years you paid 10,000. 40,000 wrote to P&L account as expense. Fourth year, partner dies. You receive 1 lakh rupees as insurance claim. What do? You write entire 1 lakh as income. You write entire 1 lakh as income, and 1 lakh will be shared between partners. So you wrote 40,000 as loss, share it to partners. You wrote 1 lakh as income, turned into profit, share it to partners. Don't you think you paid 40, they gave you 1 lakh, profit is actually 60. So what you do is when you treat it as expense, you write that 10,000 to P&L every year. In the year in which you receive full amount profit. Whereas when you treat it as asset, that JLP premium paid 10,000, you write in the balance sheet asset. Second year you paid 10 more, balance sheet asset becomes 20. Third year you paid 10 more, balance sheet asset becomes 30. Fourth year you paid 10, balance sheet asset becomes 40. Then the partner dies, you receive 1 lakh. It is like 40,000 rupees of asset sold for 1 lakh. 60,000 profit, only 60,000 will be shared between partners in profit sharing ratio. This is what we mean when we say JLP is treated as expense, JLP is treated as asset classification. Everybody got it? The moment you treat JLP as an asset, several rules that applies to asset will start applying to JLP. Conservatism is one of it. When you record JLP expense of 10,000 as an asset in the balance sheet, at the end of year 1, you will check if in case I surrender my JLP today, how much will I get? Will the insurance company give you 10? No. They say they'll pay 8,000 rupees if you surrender the policy. At the end of year 1, how much premium have you paid? 10. If you surrender the policy, how much money will you get? 8. So, asset should be recorded in the balance sheet at 8. But how much money did you actually pay? 10. But how much will you recover? Surrender value? 8. 2,000 will be written to P&L as expense in year 1. Let's say year 2, they say JLP surrender value is 18,000 or 19,000. How much did you pay in first year? 10. In that, how much did you transfer to P&L? 2. 8 is there. Second year you pay 10, it becomes 18. Surrender value, if it is 18, nothing transfer to P&L. If surrender value is 17, transfer 1,000 to P&L. So every year end, you will start showing JLP in the balance sheet at what value? Surrender value. Luckily, you don't usually have a question on JLP accounting. You only have questions in the balance sheet, questions in admission, retirement, death. What to do in that case? Very simple. Ask the question, did the partner die or did the partner retire? Did the partner die or did the partner? If the partner retires, what do you receive? Surrender. If the partner died, surrender value on the policy. Whatever money you receive is the selling price. Is the Then second question to ask, is JLP in the balance sheet asset side or it is not there on the assets? If JLP is there in the balance sheet asset side, that is the cost. Whatever money you got, no surrender value or policy value, that is selling price. Difference will be profit or loss transferred to partners capital. What if there is no asset? Full amount is profit shared to partners in profit sharing ratio. Simple. What are the two questions to ask? Question number 1. Did the partner die or did the partner retire? If he retire, surrender value. If he die, maturity amount. To take the total of the amount. Second question. Is JLP there in the balance sheet as asset? Is JLP not there in the balance sheet as asset? If it is there, balance sheet value is cost. Surrender value or residual value, whatever received, is selling price. Difference will become profit. Profit is transferred to partners capital account in profit sharing ratio. What if there is nothing in the balance sheet? Full amount sold is profit, share it to partners in profit sharing. One beautiful second adjustment will come. In the balance sheet liability side, sometimes they'll give JLP reserve. When they give JLP reserve, what do? Entire JLP reserve amount share it to partners' capital in profit sharing ratio, just like any other reserve. Just like any other reserve. We don't have accounting for JLP from the scratch usually. I can't cover it in marathon. But if you would want, this is how it would look. We usually discuss in the regular class what to do in the case of death of a partner, whatever I told you now, example wise, what to do in the case of retirement of a partner, collected, what if the asset is there, what if the asset is not there, premium treated as asset, journal entry, premium treated as expense, journal entry. JLP itself, the entire discussion is roughly about 600 700 lines. It's about good 800 lines in the book, 900,000. Oh my god, about 964 lines in the book, including JLP based questions. It is 964, you can divide roughly by 32 in a single page. 964 by 32, 30. With the problem practice, it will come to roughly 30 pages of notes. Can't discuss that in lunch, but I told you the simple logic of JLP. I hope you remember. The dissolution part of JLP is covered in dissolution part. You can get that there. And by this, I can say the JLP overview is done.
Let's now quickly revise the topic of dissolution of partnership. This is unit 6 of your chapter 10, which deals with partnership. In fact, the last unit of your partnership chapter. What do you mean by dissolution? That's going to be our first topic. And the second topic will discuss circumstances which leads to dissolution. Third topic will be consequences in the process of dissolution. Topic 4 will be refund of premium. Topic 5 will be closing of partnership by way of passing journal entries. Topic 6 will be consequences of insolvency of one of the partner. Topic 7, your favorite case law, Garner versus Murray, insolvency of one of the partner, also insolvency of all the partners, that is insolvency of firm. And in topic 8, we'll discuss piecemeal, which is again two parts, piecemeal in the case of maximum loss and also the other method, which is highest relative capital method. And lastly, we'll discuss how to account for dissolution of limited liability partnership. Without wasting much time, let's quickly begin with topic 1, introduction of dissolution of partnership. The definition is given under section 39 of Partnership Act, which says that dissolution of a firm means that the partnership between all the partners of the firm is dissolved. I want you to note very clearly, dissolution of partnership is different from dissolution of partnership firm. If it is dissolution of partnership firm, assets of the partnership firm are sold, liabilities are paid, excess money remaining after paying liabilities will be paid to partners. If in case the amount payable to partners is less, amount available is more, we pay that excess money to them, surplus, profit. If in case the amount available is less but their capitals are more, we'll give that shortage money and ask them to adjust, realization, loss. Either ways, in the case of dissolution of partnership firm, we sell all the assets, pay all the liabilities and settle the capitals. This is different from partnership dissolution. In the case of partnership dissolution, only the agreement between the partners will get cancelled. A new agreement will come. Admission, retirement, death is dissolution of partnership. Because one of the partner goes out, one of the partner comes in, or one of the partner dies, the existing agreement is no more valid. They would have to enter into a new agreement. New partnership deed comes into place. That is dissolution of partnership but not firm. Why? The business will still continue under the new agreement. Whereas in dissolution of partnership firm, we sell the assets, pay the liabilities, settle the capital. Basically, the business comes to an end. Business will not continue. In the case of dissolution of partnership, that is reconstitution of deed, we prepare revaluation account. But in the case of dissolution, we prepare realization account. I hope you have understood topic 1. Let's move to topic 2 of our syllabus. Topic 2 of our syllabus talks about circumstances which leads to dissolution. What are the situations because of which a partnership firm will be dissolved? This is given under section 40, 41, 42, 43 and 44 of Partnership Act 1932. Section 40 talks about agreement. If the partners mutually agree to dissolve, they all say, hey, yeah, come on, yeah, it's enough, we'll wind up the company, we'll wind up the partnership firm. That is section 40, by agreement the partnership firm can be dissolved. Next one is compulsory dissolution. The business that you are doing, the product that you are selling is now legally banned. Let's say you're manufacturing e-cigarettes and government told no more e-cigarettes manufacturing. You're dealing with crypto, government banned crypto. In that case, your business will get wound up. That is not voluntarily or by agreement. That is given under section 41, which is compulsory dissolution of partnership firm. Then comes on happening of certain events. This is given under section 42 of Partnership Act 1932. If you created partnership firm for a specific period, let's say 6 years, once 6 years is over, firm will get dissolved. If you created partnership firm for completion of a specific venture or a specific project, I have the land, you have the money in my land to construct the building, both of us will make one partnership. Once the building construction is complete and that flats are sold, our partnership firm is dissolved. So on completion of a specific venture, and in the case of death of a partner, it is always usually dissolution of partnership firm unless they immediately enter into a new agreement, because you cannot have an agreement with a dead person. If the agreement has 3 people's name, one of them is dead, that agreement is done. You have to immediately enter into 2 people remaining. You should enter into a new agreement, because the old agreement is now not in force anymore, because it involves a dead person. You understood? In that case again, it is almost like dissolution of partnership firm. When you say dead, it might be clinically dead or it might be financially dead. Clinically dead means stopped breathing, heart stopped. Financially dead means money is not there in the pocket. If someone doesn't have money, they'll be treated like dead body. You tell no, hana illadiravanu henakke samana. If someone doesn't have money, they'll be treated like dead body. People ignore, they don't care about you. Like that, if you are dead clinically or if you are dead financially, then the partnership firm in which you are a partner is dissolved. Firm is dissolved, not just the agreement, unless that continuing partners will enter into a new partnership agreement. I am not telling this. Section 42 of Partnership Act 1932 is telling this. Then we have notice by partners if it is partnership at will. When we entered into partnership, we have not decided any specific term. We have decided to keep the partnership at will. Till the time we want to continue, we will continue. That is partnership at will. If it is partnership at will, by way of written notice, if one of the partner proposes dissolution, the firm will get dissolved. Last one is order of court. If some of the partners have gone crazy, mad, or permanently disabled, met with an accident, 80% of the body disabled, 20% only functioning, you can't be partner in a firm, no. What will you do with that 20%? You can't even get up and go to washroom. Sad. In that case, the firm need not continue. Or one of them has done willful misconduct. Beku antane tappu. Intentionally they have done some crime or breached the terms of the agreement. They've had a non-competence agreement. No one will compete with the firm. I'm a partner. I have created one more sole proprietorship which is competing with the partnership firm. That's against the agreement, no? So again, if you do any breach of agreement or willful misconduct, unsound mind or permanently disabled, or partners are fighting so crazily that court will tell, better off you are not partners. I am telling you, dissolve the partnership firm. I can't see you people fight. So in these cases, court can give an order forcing the partnership firm to be dissolved. That is under section 44. On this, a theory question or a short notes question can come. I give a small acronym to remember this, a dead cow. What is the acronym to remember? A dead cow. Agreement, death, expiry, adventure completed means venture completed. Ad you forget, okay? It's venture completed. Dissolution by court order, compulsory dissolution, or on notice or with consent. So this is the acronym to remember. If in case it comes up for a 4 marker or a 5 marker or a 6 marker question. No need to remember the section number. Not mandatory. But if you know it, it's good. Can we proceed to next one? By this we finished topic 2, which talks about topic 2 we finished, that is circumstances leading to dissolution. Now we'll discuss topic 3, which is consequences and rules of settlement. So the accountant is here, 3 partners are there, 3 partners are asking, sir, we want to dissolve the firm, how to dissolve? Then the accountant will tell, very simple. First you sell the assets. Step 1, realization of assets. Step 2, payment of liabilities. When you say liabilities, at first you pay outside liabilities. After you pay outside liabilities, with the money that is left, you will pay partners' loans and advances. So step 1, realization of assets. Step 2, payment of liabilities. Step 3, payment of partners' loan and advance. what partner has paid to the firm over and above his or her capital. After that, leftover money will be used to pay capital. If money payable towards capital is less, money available is more, we pay extra, surplus or profit. If the money payable towards capital is more, money available is less, we won't pay some money, we will pay lesser money. That is deficiency or loss in realization. Any realization profit or realization loss, surplus or deficiency, by default it should be shared between the partners in profit sharing ratio. It should be shared between the partners in profit sharing ratio. There are exceptions. Insolvency, we'll discuss that separately. By default, any surplus or any deficiency should be shared between partners in what ratio? Profit sharing ratio. This is given under section 48 of Partnership Act 1932. And I have given you the entire what law says also. You get this? People who are watching it online, if at any point of time you would want this PDF what I am using, you can search for the link in the description and that will give you the entire notes of whatever we are discussing with the answers true or false and everything together. Yeah, and also let me know how did you like the material whenever you use it, and all the best for your exam. Let's continue with topic 4. Topic 4 talks about refund of premium. I'll tell you what is the case of refund of premium. I am a partner, I became a partner in your firm. When I was admitted as a partner in your firm, you asked me to pay some premium like goodwill, extra money. I told you, why should I give you goodwill? You told your partnership will survive for next 10 years. 10 years I'll make profit. So you're asking me to pay upfront some premium to enjoy the benefits for 10 years. I agree. Let's say I pay 10 lakh rupees and you promised me that the partnership firm will be there for how many more years? 10 years. And I'm supposed to get profits. So you promised me 10 years of profits and firm. So I have paid you 10 lakh rupees now and I became partner in your firm. After 3 years, you are winding up your firm. That's sad, no, for me. After 3 years, if you wind up, I paid premium for 10 years. I would have paid only for 3 if in case you have told this. I paid 10 lakh rupees assuming that the firm will stay for 10 and you promised. Now after 3 years, you are winding up the firm. I will say, Avela Gotila, give me back my money. I will ask and the firm might have to pay sometimes. If the firm has to pay, that is called refund of premium on premature dissolution. This is regulated by section 51 of Partnership Act 1932. When will this happen? When I was admitted, I paid premium. Point number 1. Point number 2, you have promised me a fixed term. Point number 3, firm is getting dissolved. Point number 4, firm is getting dissolved not because of me. If the firm is getting dissolved because of my misconduct, because of I want to discontinue, I want to retire, then in that case it won't be refunded. If not for my mistake, firm is getting dissolved, I was promised the term and I have paid the money, then I can claim refund. That's regulated by section 51. See this? When a partner joins a firm for a fixed term and pays a premium, which is extra amount, to existing partners for admission, and that amount is normally non-refundable. But if the firm is dissolved before the agreed term, we agreed for 10 years, you are dissolving the firm in the end of 3rd year, then you may have to give me the money. Why have I told the word may? There are conditions. What are the conditions? It should not be because of my fault. And in the agreement of the deed, partnership agreement, if you have written that in no case the refund will be made, then again I won't get. Why? I signed no. You understand? So may be refunded proportionately. What are the conditions? Without my fault, the firm should be dissolved, and it should be dissolved before the end of the term. You promised 10 years, 10 years is over. Can I ask refund? No. And no agreement to the contrary, meaning I gave you 10 lakh rupees, but in the agreement you wrote that in no case the firm will refund the premium, then I won't get it back. Are you getting it? So number 1, not because of my fault. Number 2, premature dissolution. Number 3, there is no agreement saying that it will be not refunded. In that case, I can take it. No refund when it's because of my misconduct. No refund when I am pushing the firm to be dissolved or I am retiring. No, a refund when the firm is getting dissolved because of death of a partner, or no refund if agreement says that we should not be refunding that money. Same thing I have given it in 2 different languages, but I hope you understood. This is the topic of refund, which is topic 4 of our chapter. I have given the exact same section 51 extract also if you want to. And lot of times if you read this one-liner, it will help you remember the entire concept that we have read. We did a question where refund will be given, where it will be not given. We did true or false also on this. Then we'll go to topic 5. What is topic 5 in our chapter? Closing the books of the partnership firm. How to close the books? Closing of the books is done by way of realization account. Done by way of realization accounts. Again, this is also section 48 only. That is, sell the assets, pay the liabilities, pay the advance of the partners, then repay the capital. Same thing, but in this topic we are learning accounting entries. What to do in the beginning? First, close all the asset and liability accounts by transferring them to realization. How do you close it? Asset will usually have debit balance. If you have to close it, you would have to credit the asset. Debit will be realization. Entry will be realization account debit to asset. If in case you want to close the liabilities, what will be the entry? Liabilities will usually have credit balance. If you want to close them, you would have to debit. Entry will be liability account debit to realization. After this, you will sell the assets. When you sell the assets, you receive cash. Usually for sale of asset, entry is cash to asset. Here we won't credit asset. Why? Asset is already credited by rating to realization. So on the sale of the assets, write the entry as cash account debit to realization account. Cash account debit to, this is the entry for sale of assets. When you write this entry, ignore sale price, book value comparison and profit accounting. Just write this entry cash to realization for sale price. Write the entry cash to realization for sale price. Don't try to account profit separately. Profit will be found for sale of all the assets, settlement of all the liabilities together at the end. Next one, if in case liabilities are paid, what is the entry? Usually entry is liabilities to cash. Here we won't debit liabilities. Instead of debiting liabilities, I'll debit realization. Entry will be realization account debit to cash or bank. After that, what if any of the asset is taken over by partner? We should pay the cash to partner. Instead of we paying cash to partner, he takes over our asset. So we don't have to pay him so much money. His capital will decrease. Entry will be partner's capital account debit to realization. Partner's capital account debit to realization. What if liability is taken over by partner? See, we are supposed to pay cash. Before we pay cash, he is taken over the liability, meaning he paid cash to the liability. So we have to give money to partner now. So partner's capital will increase. Credit partner's capital. Debit realization. Entry will be realization account debit to partner's capital account. Then dissolution expenses. To sell assets, to settle liabilities, it might not be an easy task. We might have to incur some expenses. Brokerage, stamp duty, transportation, legal paperwork, all of that. If in case we paid any of that, any expense or any income, any profit or any loss arising in the process of dissolution will be always returned to realization account. Entry will be realization account debit to cash. What if the same realization expense is paid by partner? If partner pays, I will not write entry. Will the firm write entry? Firm will like, no, I will not write. But if the partner has paid and we are supposed to pay partner, then we'll write entry. If partner has paid on our behalf and we don't have to reimburse, then no entry. If we owe that money to partner, partner's capital will increase. Credit partner's capital, debit realization. Entry will be realization account debit to partner's capital account. Everybody got this? What if there is profit in the process of realization? Any profit on realization will be transferred to partner's capital account. Any loss on realization also will be transferred to partner's capital account. Profit credit to partner's capital because it will increase. Loss debit to partner's capital because it will decrease. What is the entry for profit? Realization account debit to partner's capital. Entry for loss, partner's capital account debit to realization. I hope everybody understood the accounting entries. If you prepare ledger out of this, this is how it will look. When you transfer assets, realization to assets. When you transfer liabilities, by liabilities to realization. When you sell the assets, cash to realization, here you will write by cash. When you settle liabilities, realization to cash, here you will write to cash. Instead of you receiving the cash, if the partner has taken over, credit partner's capital account here. If partner has paid a liability, debit side will write to partner's capital account. And ultimately you find profit or loss. Excess of credit over debit will be profit share to partners. Excess of debit over credit will be loss share to partners. I hope everyone understood. All the assets will be transferred to realization except cash. Cash will open one separate ledger. All the liabilities will be transferred to realization except capital and reserves. Capital you write to partners capital, reserves you share to partners. If in case there is P&L account debit balance or any other accumulated loss, don't transfer to realization, transfer to partners capital account in profit sharing ratio. Cash receipts and cash payments will be recorded separately. Don't net them off. I've received this much, I've paid this much. Netting amount is not allowed. And don't even net off debtors and provision. Let's say in the balance sheet asset side there is debtors 10,000 in the inner column minus provision 1,000, 9,000 in the outer column. What do you have to do? Debtors is 10. When you transfer assets here, transfer 10. Provision 1,000 you transfer as a liability separately. I hope you got it. Then don't try to identify profit or loss on sale of assets or settlement of liabilities individually. Profit or loss for the entire realization process is identified as a lump sum, whole amount at once. I hope everybody understood this. Fantastic. That's how you prepare your realization account. Last point to note, if nothing is mentioned, assume asset realizes 0 rupees. If nothing is mentioned, assume liability is settled at book value. Usually they will mention all the asset sale price, all the liability settlement price. If they don't mention, assets are sold for 0 rupees, liabilities are settled at book value. Why? Conservative approach. What is this? Very nice. Then we did set of questions on accounting entry. I gave you an acronym and I also made you do some true or false questions on that. Now extension of topic 5. Topic 5 extended. We'll discuss joint life policy. What is joint life policy? It is the policy taken by the firm on the lives of the partner, so that if the partner dies, policy matures, insurance company will give us money and that money will be used by the partnership firm to pay the partners. This is same thing what we read in admission, retirement and death. What you have to remember is policy will not mature if the firm dissolves. Policy will mature only if the partner dies. So in the case of dissolution of partnership, at the time of dissolution, what will happen to JLP? JLP will be surrendered. JLP will be, now there are two possible cases. One, JLP is already there in the balance sheet as asset. Two, JLP is not there in the balance sheet as asset. So why and how will JLP appear in balance sheet? We have two treatments. No, you would have written admission, retirement, death. If JLP premium that you pay is treated as expense, it will go to P&L expense. It will not come in balance sheet asset. If JLP premium that you pay, if it is treated as asset, then it will come in balance sheet as asset but at surrender value. Let's take first case. Joint life policy premium paid is treated as asset and it is shown in the balance sheet on the asset side. What to do in the process of dissolution? Simple. Treat it like just another asset. Any asset in the balance sheet, what do you do in dissolution? Transfer it to realization. Entry will be realization to asset. This also same. JLP asset at surrender value in the balance sheet will be transferred to realization by passing the entry realization account debit to asset account. What is the name of the asset? Joint life policy. Understood this? After this, this policy will be surrendered because firm is only not there. Policy itkonde en martira. Insurance company will give you surrender value. This is nothing but sale of asset. What is the entry for sale of asset? Cash account debit to same entry. Cash account debit to realization. You wrote the same entry that you pass when you sell the asset. Are you getting it? Sir, I did not sell the asset, sir. My partner took the JLP policy. He told he will surrender and he will collect cash. Entry will be same like asset taken over by partner. What is the entry when partner takes over the asset? Partner's capital to realization. If we sell, cash to realization. If partner takes over, partner's capital to realization. If joint life policy is taken over by partner, entry will be partner's capital account debit to realization account. What is the entry? Partner's capital account debit to, very good. Then what if the policy lapses? You have done some breach of agreement. Policy will lapse. Insurance company will not give surrender value. Then two treatments. One, transfer the asset to realization but no cash realized. Leave it there. Or instead of transferring to realization and not receiving any cash, instead of writing realization to asset, straight away write partner's capital to asset. What is this joint life policy here? This is asset. This is asset account. I'll write JLP. Shortcut, easy for you to remember. If the asset is getting sold, there is a point in transferring to realization. If it's going to realize nothing, you can just trade partner's capital to asset and close, writing off the asset directly to capital. Or if you want, you can write realization to asset, but don't write any cash to realization entry. Either ways it is same, but ICAI usually follows the approach of writing partner's capital to JLP when it is written off. There was a question on this in the chapter of dissolution of partnership firm when this chapter was in CA intermediate before May 2024. Ever since May 24 when it has come in foundation, there is no question on this value, this transaction. But anyways, I'll just tell you, keep you prepared. One fine day institute wants to make paper difficult and they put this adjustment, you still know how to do it. Lastly, what if there is JLP reserve in the balance sheet? Don't get worried. Treat it like just another reserve. What is the treatment of any other reserve? Share it to partners in profit sharing ratio, general reserve. Same thing you do here also. Reserve will have credit balance. Debit the reserve. Credit partners capital account. Entry will be joint life policy reserve account debit to partners capital account. Share that JLP reserve to partners in what ratio? Profit sharing ratio. Everybody got this? Fantastic. So by this we are done with topic 5. Can we go to topic 6 now? Topic 6 of our dissolution of partnership firm talks about consequences of insolvency of partner. Meaning, if any of the partner becomes insolvent, what to do? To begin with, we'll understand what do you mean by insolvency. It is not randomly one person is called insolvent. To be calling a partner insolvent, number 1, there should be realization loss in the partnership firm. What should be there? Realization loss. That realization loss, when you charge it to capital, when you debit it to capital, capital becomes negative. And that capital becomes negative means capital has debit balance. A partner has to pump in cash to make his capital good. But to bring a cash, he has to sell personal assets. If he sells his personal assets, they are not sufficient to pay his personal liabilities only. If he sells his personal assets, it's not sufficient to pay his personal liabilities. Then we call a partner as insolvent. So remember the order. Number 1, loss. Number 2, loss has made capital negative. Number 3, he does not have money to pay. Meaning, if he sells his private assets, it's not sufficient to pay his private liabilities. How can he pay money to firm? That's when partner is called insolvent. Are you getting it? Basically, when you sell all the assets and you start paying liabilities, there is no enough money to pay liability. Liability will be discharged only when the partner brings cash. But for the partner to bring cash, he is not RBI to print cash, and in his home there are more liabilities than asset. He has to pay more money than the assets that he has. His personal debt only is not able to pay. How will he pay partnership firm's debt? That's when we call the that's when we call the partner as insolvent. Did you understand this? He has to pay, but he has nothing to pay. See, a partner is said to be insolvent when he cannot pay his debts in full, his capital shows a debit balance, then his insolvency, the money what he should bring but he cannot bring, will be borne by solvent partners. It will be borne by, firstly, as per partnership deed. If partnership deed doesn't tell how to adjust it, then we'll go to Garner versus Murray case. First we should apply what? Partnership deed. If partnership deed says something, follow that. If deed doesn't say anything, then we'll apply Garner versus Murray case law. You understood this? This is basically told by section 45 and section 49 of the act. I made you understand when is it deficiency, when is it not deficiency and everything. We'll however cover that in the next case. I would want you to come to the next part. Debit balance doesn't mean insolvency. Did we discuss this? If there is realization loss and that loss, when you deduct it from your capital became negative, but you have enough cash privately to bring in and then make your capital good, then is it insolvency? It is insolvency when your capital is negative and you don't have money to make it positive. Firm has loss. Loss makes your capital negative. You have money in your pocket. You might have made loss, but you are not insolvent. You have loss, you don't have money also. Then you are insolvent. I gave you a small box understanding debit balance and insolvency are not same. Debit balance idre insolvency agbodu. Debit balance idagella insolvency alla. Did you understand this? Very nice. We discussed this part. Then we went in to discuss when is he insolvent, when is he not insolvent, how to deal with deficiency and everything. Then one important point I told her, if in case insolvency has happened because of his own misconduct, other partners will not bear your loss. Rama, Bhima, Soma are partners. Soma became insolvent. Soma's insolvency is borne by Rama and Bhima. But if Soma becomes insolvent because he did gambling, he did Dream 11, he did some gaming app mein full money woodies, he played Ludo, he played online rummy, he wasted all his money, then Rama and Bhima will not bear Soma's loss. Insolvency of a partner is borne by the solvent partners if it's not because of willful misconduct or breach of agreement. Understood? Then we went into topic 7. Wow, my favorite. Garner versus Murray. It's a case law what happened in 1904 in English country, not here, in England. Now, when will you apply this? Point number 1, partner should be insolvent. Insolvent means loss, negative capital, no money to bring. Loss, negative capital and no money to bring. That's when he is insolvent. So, partner should be insolvent and only one partner should be insolvent, or not all the partners should be insolvent. One of the partners should be insolvent, or two also, but not all. Not all the partners should be insolvent. And the next important condition is basically he cannot bring cash to fulfill its deficiency, and partnership deed is silent. Partnership deed is only then will apply Garner versus Murray. What if Rama, Bhima and Soma are partners and they have a partnership deed, and in that partnership deed it is told what to do if one of the partner is insolvent? Then we will go to Garner versus Murray. No, we will do what partnership deed tells. Only and only if partnership deed is silent, then we will apply Garner versus Murray case laws learnings. I hope everybody understood. So the next thing for you to note, how to apply this? Very simple, yeah. If in case there is loss, that loss will be borne by them in profit sharing ratio. The argument in the case of Garner versus Murray was very simple. The argument says that the insolvency of one of the partner power issues. Now it's restored. Insolvency of one of the partners is not operating loss, it is capital loss. Operating means you buy inventory, you sell inventory, you buy goods, you sell goods. That loss is operating, profit sharing ratio. But if the loss is capital in nature, it should not be shared in profit sharing ratio. It should be adjusted in capital ratio. That's the argument. Why did this come? Very simple. Garner, Murray and Wilkins, three of them were partners. Garner, Murray, Wilkins, three of them were based on business madadru. Wilkins became insolvent and Wilkins capital had 263 pounds deficiency, and both of them, Garner and Murray, have capital as 500 pounds and 300 pounds, but their profit sharing ratio is equal. Garner is telling this 263 pounds deficiency of Wilkins, we both, Garner and Murray, will share 1:1 ratio equal. Murray is like, adengagatte. This is not revenue loss for us to share equally. Let's share in the ratio 5:3, capital ratio. They both went to the judge. Sorry, they both went to the lawyer. Lawyer looked into the partnership deed. Partnership deed did not tell anything. Then what happened? Partnership deed was silent now. Then the lawyer told it is debatable. It can be 1:1, it can be 5:3. Then Garner appointed a lawyer who told 1:1 because yes, he can bear less loss. Murray appointed a lawyer who told no, it should be 5:3. I should get less loss, you should get more loss. And they both went to the court. The judge gave the decision saying that this is not revenue loss, this is capital loss. So the deficiency of Wilkins 263 should be borne by Garner and Murray, not in the profit sharing ratio 1:1, but in the capital ratio of 5:3. But the judge gave couple of other points also. Judge gave couple of other insightful points also. Judge told if the solvent partners has to bear the insolvency of the other partner, these partners should have credit balance in their capital. Understood? Only then they can bear. What if Garner had debit balance in his capital? Then the entire insolvency of Wilkins should be borne only by Murray. That was the judgment given there. Ever since 1904, we are following the same case law even today. But remember, this is not applicable if the partnership has a deed. You understand? I'll share another beautiful video on discussion of this case separately, but for now that was the overview. Now quickly come back. So when do we apply Garner versus Murray? When the partnership deed is silent. So when the partnership deed is silent, partner is insolvent and he cannot bring money, then how will we adjust it? Solvent partners with credit balance in their capital account. Who? Solvent partners with credit balance in their capital account will bear the insolvency in capital ratio. Solvent partners with credit balance in their capital account will bear the insolvency in capital ratio to the extent they have capital, not beyond that. So that was the discussion here. When we say capital ratio, which capital ratio? Depends upon the capital system followed by the entity. If the firm follows fixed capital system, fixed capital is there, no? That ratio. If the firm follows fluctuating capital, capital just before dissolution, capital just before dissolution, before starting with dissolution process, whatever is the capital, that capital ratio has to be taken. Am I right? This is not applicable when one of the partner does misconduct. This is not applicable when all the partners becomes insolvent. When all partners become insolvent, we don't pay only. That's our next topic for discussion. That's called deficiency. We'll discuss that next. So I hope you understood this. This case law will not be asked in the exam. This is beyond books. Certain places I have given beyond books, meaning that's not required for exam, but I've just given it so that you know. True or false discussion also we did on this. Then capital computation I've given small theory. I explained it to you how to do. Then we did some small questions where you need to apply and also pass accounting entry. What is the accounting entry to adjust the insolvency of one of the partner? Very simple. Insolvent partners capital deficiency you credit and debit it to the solvent partners in capital ratio. For example, if Soma is insolvent, credit Soma and debit Rama and Bhima in what ratio? Capital ratio to the extent they have credit balance in their capital account. That's applying Garner versus Murray. One point that we did in the class when we were doing questions, I want you to note when we are doing problems later is very simple. Whenever there is insolvency, whenever you are applying Garner versus Murray, first close realization account by finding loss, transfer it to capital, check the debit balance in capital, then you conclude that is insolvent. Then before you apply the deficiency adjustment, first receive the realization loss in cash from the partners. Receive the realization loss in cash from the partners. After you receive the realization loss, meaning one of the partner will not pay full amount, he can only pay 25 paise in a rupee or 1/3, sometimes he might not be able to pay. Then find the balancing figure in that insolvent partners column as deficiency. That you write it in that insolvent partners capital account credit side by debiting other solvent partners. Share it to solvent partners capital account debit side in capital ratio. I just gave you one summary of what you should do when you do big problems. We've done enough AQs on that for you to cover up. Then topic 7 continued. Same thing what we continuing. We discussed about insolvency of one of the partners. What if all the partners are insolvent? Or what if all partners except one is insolvent? That one solvent partner, he has debit balance in his capital account. Then what will happen? Who will cry? Then the liability holder will cry. You won't cry. So whenever the firm sells its assets, it gets cash. That cash is used to pay liabilities. What if the cash available at the beginning plus the sale of the assets plus the money recovered from solvent partners, it is together not sufficient to pay liabilities? Then what to do? Then that liability holder will not get money. That's called deficiency. What is deficiency? Cash available plus consideration from sale of assets plus collection from solvent partners together is not sufficient to pay liabilities on dissolution. Then to the extent liabilities you cannot pay, we call it deficiency. In the case of deficiency, you cannot do your normal process of transfer all assets and liabilities to realization. Why? Realization loss will become so huge that if you share that realization loss to partners capital, capital will become negative. And usually capital account balancing figure is cash. Partners capital and cash will tally. Here you can't close partners capital by cash. Why? They won't bring cash. So what to do? That is the case of deficiency. In this case, what to do? Very simple. Don't transfer liabilities to realization. Don't transfer liabilities to, we discussed this in an AQ. Don't transfer liabilities to realization. This other liabilities, whatever is there, don't transfer. You open one separate ledger. Asset is there, no, 1 lakh. In realization, you write asset 1 lakh. Liability, you don't write in realization account credit side. Instead, open a separate ledger, other liability account, and write it there. Then you sell the assets and receive the money. Understood? Identify realization profit or loss without settlement of liabilities. Transfer it to partners capital. In cash account, you know how much cash is available in the beginning? Nothing. On sale of assets, how much cash did you receive? 30. That cash of 30 available will be used to pay liabilities. I'll repeat, transfer all the assets to realization, sell the assets. Liability, don't transfer to realization, open separate ledger. From cash that is available, cash account balancing figure, don't write to partners capital. Cash account balancing figure, you put it to liability. You don't have enough to pay liability. Balancing figure that you get in liability is the money that you should pay, but you don't have and could not pay. I'll repeat, money that you have to pay, but you don't have, so you cannot pay. This will be transferred to a separate account called deficiency account. And this deficiency will be shared to partners in profit sharing ratio. Profit sharing ratio? No. Write this other liabilities here. Partners capital account, you find individual balancing figures. That should match with this. I'll repeat, transfer all the assets to realization. Liabilities open separate ledger. Cash account, you close it by transferring the cash balance to deficiency. In deficiency, close the cash account by transferring the balance to liability. Liability, to the extent you don't pay, that will be deficiency. That deficiency should match with deficiency in capital. You wrote this realization profit or loss, that you will transfer to partners capital. In partners capital, there is shortage, that they should bring in cash, but they can't bring. Individual amounts you ignore. Total of the deficiency in partners capital should match with total of the deficiency in deficiency account. You get this? You look at this example peacefully later, you will definitely understand. I have slowed it down and aram se I have given it. You guys understand this? Usually partners capital account and cash account will match, no? In dissolution. Here cash they can't bring. So what do? Partners capital account has to match with cash, but cash they won't bring. Whatever cash is there, you put to liability. Liability balancing figure deficiency. Deficiency and capital will match. What is deficiency? Cash that they should bring, but they cannot bring. What is deficiency? Cash they should bring, but they cannot bring. That will match with the cash that they don't bring in capital. Capital is negative 10, deficiency is 10. That matches, and we've closed the accounts. Good one. There's a question on this in the study material. You can try that as well. So that's our topic 7, which talks with insolvency of individual partner, Garner versus Murray, insolvency of all the partners, deficiency account. If all the partners are insolvent, then the firm is insolvent. If all the partners are insolvent, then the firm is, we discuss this. Then we'll go to 8th topic, which is piecemeal distribution of cash. See, usually you like preparation of realization account, partners capital account, cash account, but that happens at the end. When you sold all the assets, when you paid all the liabilities, when you know full cash position and capital position, at the end you do that. That is like final accounts. But imagine your sole proprietorship concern. To do final accounts, you need trial balance. Am I right? You like opening the trading account, right? Opening stock purchase, sales, closing stock, GPO, so nice. But to do that final accounts, you need trial balance. To do trial balance, you need ledger. To do ledger, you need journal and subsidiary book. To do that, you need to identify transaction. Throughout the year, you do identifying the transaction, recording, journal, subsidiary book, ledger, trial balance. End of the year, you do final accounts. So realization account, cash book, and partners capital account is end of the year business. End of the year business, meaning what? That is what we do when everything is available. But gradually, when you keep selling the assets throughout the year, this month I sold one asset, next month I sold one asset, third month I sold one asset. Will we keep all the money with us and tell the liability holders, I will not pay now. After I sell all the assets, I will pay. Can you tell that? No, that's too late to say. So you gradually start paying. That's piecemeal. You can't eat full chapati at once. You cut it into small pieces and eat small pieces at a time. All the assets cannot be sold in slump sale at once because no one is willing to buy. You sell one asset, you got little money, you pay little liability. You sold one more asset, you got little money, you pay little liability. Do we do piecemeal or realization? In reality, during the process you do piecemeal, at the end of the process you do realization. During the match you see live match, ball to ball, at the end of the match you see highlights. It's like that. Entire realization, partners, capital account and cash account is like highlights. This is piecemeal, is like what's happening throughout. Are you getting it? This is again reference to section 48, order of settlement. First you pay outside liabilities. First you sell assets, then you pay outside liabilities, then you pay advances of partners, then you pay partners capital. When you pay outside liabilities, when you pay partners loans and advances, there is no method, it's the same, and all the outside liabilities have same priority. If you have creditors bank loan 10,000 and 15,000, whom do you pay first? In 1:1.5 ratio you pay both. There is nobody has priority over the other. After you pay outside liabilities, then you pay partners loan. After that, when you're paying partners, then you have two options. What are the two options? Maximum loss method, highest relative surplus capital method. How many options do you have? Maximum loss method, highest relative surplus capital method. How do we apply the methods? Very simple, yeah. Maximum loss method, we will compute how much is loss. We will compute how much is loss. How much money they will not get. How much money they will not get if you find. How much money they will get is balancing figure. Capital to be paid minus loss that I won't pay. Amount to be paid will be found as balancing figure. That is maximum loss. It's a pessimistic approach. Whereas, how do we do it under highest relative capital method? Very simple. Here, we don't compute loss. We will compute the amount that we should pay. We will compute the amount that we should pay. If I say capital is this much I will pay. If I compute, what I will not pay is found as balancing figure. You understood what is the difference between these two? If I prepare a partner's capital account, amount payable to partners is on the credit. If I compute loss, write it, then I'll find balancing figure as amount paid. It is maximum loss method. What method is this? Under highest relative surplus capital method, what will I do? I know the amount to be paid. I'll compute the amount I'll pay based on the availability. I'll find loss as balancing figure. This is highest relative surplus capital method. In order to do, what do you say, maximum loss, out of the amount available, amount payable, deduct the amount available, you will get loss, share the loss in profit sharing ratio. Balancing figure will be amount to be paid. Under this, what do? Write the capitals, write the ratio, divide capital by ratio, you will get capital per share. Keep that and find surplus, deduct it from the capital. Then you will understand what is the surplus, relative and absolute, and first pay absolute surplus, then pay relative surplus, then pay capital as per base. For those who are watching it online, if in case you find this very tricky, I'll pin another link, one question on maximum loss, one question on highest relative surplus capital method. If not, please do ask me in the comments and I'll share one question on each for you to practice. That's with regard to piecemeal. By this we finish our piecemeal distribution. Both the methods are same, by the way. Answer will be exact same. But in the exam they'll ask one of them. Whatever they mentioned, please try that. Then after that we come to the last part of our chapter, which is dissolution of limited liability partnership. Now let's discuss topic 9, which is dissolution of limited liability partnership. This is regulated by section 63 and 65, 63, 64, 65, not of Partnership Act, but of LLP Act. Which Act? LLP Act, Limited Liability Partnership Act. So what does this say? See, like how we dissolve partnership form, 3 people cannot sit in the room and then discuss and decide. For LLP dissolution, you have to take order from the court. You have to take permission from the regulating authority, MCA. You can't decide it just like that and then the firm is dissolved. Even if you take a decision, you would have to take consent from the tribunal or court, basically NCLT. Till then it's not wound up. Compulsorily also it can be wound up by NCLT. Voluntarily you can also decide, or your liability are there, no creditors, they can also decide and push for it. The only difference between limited liability partnership dissolution and partnership dissolution is the liability of the partners are limited. Rama, Bhima, Soma are partners. if the firm does not have enough money to pay liabilities, Rama, Bhima or Soma, neither of them are supposed to get extra money. They are not required to. Why? The liability is limited. Personal assets of the partner are liable or not liable. Personal assets of the partner are not liable to pay the debts of the firm. In no case will they bring in their personal assets money unless it is their default, it is their willful misconduct. Because of that, the firm is going into this situation. In that case, they can be sued. Otherwise, the personal assets of the partner are not liable to pay the dues of the firm. I have given difference between firm and LLP and how the dissolution will be slightly different. There's one question on this in the ICAI study material, question number 9 if I am not wrong. Please do that, and I hope you people will be really comfortable and ready to ace questions in the exam on dissolution of partnership.
Company accounts. So how does the company raise money? How does the company function? I don't want to put little stress on salient features of company. What is the company? Company is a company registered under the act. All of that I'm not trying to spend time and energy. Quickly going to the topic of discussion wherein the company will raise money. How does the company raise money? By issue of shares, by issue of debentures, or by taking loan from financial institutions. Right now, what we're talking about is issue of shares. This is the first unit. Whenever second unit basically, whenever the company is collecting money for issue of shares, they can collect it in three different stages. Stage one is called application. Stage two is called allotment. Stage three is called call. Stage one application. Stage two allotment. Stage three call. Basically, money will move to share capital. When the money is going to share capital, it will go through share application. It will go through share allotment, or it will go through share call. Are you getting it? You can keep multiple calls: first call, second call, third call, fourth call, final call. You can keep last but one call. This is last call. You can keep how many ever calls you want. It's up to you. But it's called as call. In the application stage, first the shareholder will give the money, then we will transfer to share capital. However, in allotment and call stage, company will allot and then ask money. Company will make the call and then ask money. Remember, in application stage, who will take the first step? Shareholder. Who will take the first step? In allotment and call, who will take the first step? Company. Imagine this side is bank account. This side is capital account. This side is bank account. This side is capital account. From bank account, money is going to capital. From bank account, money is going to capital in three ways: application, allotment, application, allotment. With regard to application stage, no. First we receive money, bank to share application, then share application to share capital. First bank to share application, then share application to. With regard to allotment and call, company will first do share allotment to share capital, share call to share capital. They will do it. Then you will receive bank to share allotment or bank to share. At application stage, first entry is bank account debit to share application, then share application to share capital. But allotment and call, first you will do allotment to capital, call to capital, and then you will do bank to allotment, bank to call. I hope you understood this little Bharatanatyam. It doesn't look like Bharatanatyam. It will be disrespectful. Please don't scold me in the comments saying that this is disrespect to the culture. I am not a dancer. I am sorry. I just give a small reference so that people will. Yeah, I hope you understood this. See, entry for application. What is the entry? Cash to application, then application to capital. Allotment stage entry, allotment to capital, then bank to allotment. Then call stage, call to capital, then bank to call. I hope you understood. Very good. Nominal value and issue price are not same. They are different. Nominal value and issue price are not same. They are different. Nominal value is the face value mentioned on the certificate, whereas issue price is the rate at which the share is issued. Nominal value is the value mentioned in the share certificate. Issue price is the money that is collected by the bank, that is collected by the company. Are you getting it? Issue price can be more. Issue price can be same. Issue price cannot be less. Issue price can be more or can be same of nominal value. Issue price cannot be less. Why? Issue of shares on discount is forbidden under Companies Act 2013. Can a company issue shares at par? Yes. Can a company issue shares at premium? Yes. Can a company issue shares at discount? No, you cannot issue shares at discount. I hope you understood. What is the entry? What is the entry when you issue shares at premium? Very simple. Whatever the premium money collected, at first it's kept in share application. When my shareholder gives me money, bank account debit to share application. That share application box will include capital also, will include premium also. In application box, I won't classify. From share application, when I'm transferring to share capital, then I'll bifurcate. How much to share capital, how much to security. So first entry, bank to share application, premium is included. Second entry, share application to share capital to security premium. If there is any premium, at what stage will it be classified? At the transfer to capital stage, not at the collection stage. Are you getting it? Whenever you credit share capital, you should credit security premium. The premium is there on issue. Whenever you credit share capital, that's when you credit security premium. Did you understand this? Let's proceed. What if the allotment stage where there is premium? Can you collect the premium on allotment? Your choice. You want to collect it in allotment, you collect in allotment. You want to collect in application, you collect in application. Can a company collect premium in call stage? Yes. There is no restriction. At allotment stage, will the shareholder take the first step or will the company take the first step? First, you will transfer share allotment to share capital. When you debit share allotment, it will include premium. When you credit share capital, you will credit security premium. Later, when you write bank to share allotment, that will be full amount, nominal value plus premium. So, when do you credit security premium? When do you credit security premium? When you credit share capital. Credit premium when you credit. Very good. Remember this one. This is something that you can put tattoo. On the statement ಹೇಳ್ತೀನಿ. This and all, whenever you feel like putting tattoo, you can put that sentence. Credit security premium when you credit share capital. Credit security premium when you credit. Okay. Very nice. So this is something that you should note. On this, we do few questions. Then after that, I'll take you to the next concept. What do we have after that? After that, yeah. After that, we'll discuss calls in arrears and calls in advance. Calls in arrears and calls in. What is calls in arrears? You have asked the money. Shareholder is like, I will not pay. You asked them for money, but they did not pay. What is it? Calls in arrears. What is calls in advance? You did not even ask. Before that only they paid money. What is calls in arrears? We have asked, but they have not paid. What is calls in advance? They have not asked, but they have paid. As a company, I have allotted shares. I made call. We did not pay call money. To me, it is receivable. It is asset. Calls in arrears is an asset to the company. Calls in advance, I have not asked him to pay money. He's already paid. So it is like pre-received. It's a liability to the company. What is it? Everybody understood this? Very good. On calls in arrears, company will collect interest. He is paying late, pay with interest. On calls in advance, company will pay interest. Are you getting it? When the company is paying, no, company will give more, 12%. When the company is collecting, no, company will collect less, 10%. I'll repeat. When the company is paying, company will pay more, 12%. When does the company pay? Interest on calls in advance. When the company is collecting, no, company will collect less. Interest on calls in arrears. Income will be less at 10%. Expense will be more at 12%. I hope you understood. For what period do you compute interest? Interest is P into T into R. P amount, T time, R rate of interest. What time do you compute interest for? You compute it from the date of receiving to the date of call. Not from the date of call to the date of receipt. For example, arrears. I made the call on 1st of January. He's supposed to pay on 1st of January. He paid on 1st of March. How many months delay? 2 months delay. I'll compute interest for how many months? Arrears. Understood? No. Advance. I am making the call on 1st of June. I'm making the call on 1st of. You should pay money on 1st of June. No. 1st of March only he paid money. He paid how many months advance? March, April, May. 3 months in advance. So I'll give him 3 months interest. Are you getting it? Tell me, for what period do you compute calls in advance? Interest on calls in advance. Date of collection to the date of actual collection that should have been made. Arrears, date on which he was supposed to pay to the date on which he has paid. For that difference, we compute interest. Interest on calls in advance is expense. Interest on calls in arrears is income. Did you understand this? Very good. Now, this is how it is. Application money is paid by the shareholder. Allotment money he did not pay. So this will lead to calls in arrears. Are you getting it? Company will collect allotment money plus 10% interest from this person. Make some noise. Very good. To the shareholder, it is liability. To company, it is asset. Journal entry. Allotment made. Share allotment to share capital. If he pays money, I would have written cash to share allotment. Because he did not pay, I cannot debit cash. Instead of debited, calls in. I hope you got it. Then later date when I receive the money, then I'll write bank account debit to calls in arrears. I might not just receive the arrears money, I might also receive interest. So I'll write the entry bank account debit to calls in arrears to interest on calls in. Entire money is received. Whatever is this interest on calls in arrears which is received is income. It will be transferred to P&L. Entry will be interest on calls in arrears account debit to P&L. Interest on calls in arrears account debit to say something. Very nice. Look at the next one. What is calls in advance? It's simple. Okay, that whatever we computed, no arrears. It can arise in allotment stage. It can arise in call stage. Call stage how? Is paid application money. Is paid allotment money. He did not pay call money. Possible or not? Very much possible. Then let's see calls in arrears. Sorry, calls in advance. What is calls in advance? Company has not made allotment. Shareholder has already paid the money. Are you getting it? So I'll write the first entry as bank account debit to share application. When I'm transferring share application money to share capital, I realized he has given me more money on application than what he should have given. Maybe because of oversubscription when I did pro-rata allotment, I've collected extra money. Such extra money collected will be transferred to calls in advance. I instead of an option, I can reject and refund that money to him. If in case I don't refund, such money will be transferred to an account called calls in advance. It will stay in calls in advance till allotment. When I make the allotment, share allotment to share capital. Next, when I receive money, I should write back to share allotment. Then I will not debit bank. Why? Whatever calls in advance was credited here will be now debited. Because I had previously collected extra, that excess amount collected will be now debited. Understood this? Is something. Fantastic. Then we pay interest on calls in advance to them for that period in advance the paid. That interest will become expense, so I'll debit it and credit bank. Later I'll transfer that interest to P&L. I hope you understood. After this, you'd solve further more questions. Next, we'll discuss forfeiture again. Forfeiture. Interest portion you understood. You know how to do problems also. You remember two concepts. One is oversubscription, other one is undersubscription. If the number of applications that you receive is more than the applications that you called, it's called oversubscription. However, if the number of applications that you receive is lesser than number of applications that you called, it is called undersubscription. In the case of oversubscription, can you accept all the applications? No, you should accept only what you called for. That excess applications received, you have two options. One, either you can reject and refund. Two, keep it as advance and then adjust it against the next call. Are you getting it? Is something. Or we can follow combo also. Part of it rejected, refunded, part of it kept with us towards allotment. Either is option. Calls whenever there is under subscription, meaning applications received is only less. Company cannot proceed with issue. Company cannot, in order to proceed with issue, there should be minimum 90%. Minimum is how much? If we get minimum 90, I can continue. If I don't get minimum 90, I can't proceed with subscription. I have to wait. I have to wait and then go for reissue. Again, cancel that and then go for the same issue again. Only then, if I get again more than 90%, then I can proceed. Otherwise, I cannot proceed with issue of shares. Fantastic. Then let's go to the next topic. What do we have? What do we have? What do we have? These are all questions that we usually solve. Forfeiture and reissue. What do you mean by forfeiture? Let's say one shareholder did not pay money, calls in arrears. I will wait. I will wait. I will wait. After waiting enough time, the shareholder still doesn't pay. What do I do? I'll give him warning. Still doesn't pay. I'll give him time. He doesn't pay. I give him notice. He doesn't pay. After that, what do I do? I can't sit and cry, no. As a company, after giving enough time, opportunity, and notice, if the shareholder still doesn't pay that money, I will cut the share. Whatever share was in his name, I'll take it back from him. This process of taking the share back from the shareholder for non-payment of the money is called as forfeiture. What is it called as? What do we do in forfeiture? Take the share back from the shareholder. Take the share. Okay. It is opposite of issue. What is the entry that we write in issue of share? Cash account debit to share capital. Okay. If they would have given money, cash. If they have not given money, call scenario. What if they've given little and they've not given little? Cash account debit, calls in arrears account debit to share capital. This is the entry on issue. What is the entry on forfeiture? Ulta. Share capital, whatever I've credited here, I will debit it. Am I right? Cash account, whatever I've debited here, I will not credit it. Share forfeiture. You understood? Capital, whatever I've credited on issue, I will debit on forfeiture. Cash account, whatever I debited on issue, I will not credit. I will credit it to share forfeiture. There will be no refund. There will be no and calls in arrears, whatever was recorded as an asset by debiting in the past, I will now credit it. I will now, why? It is no longer an asset. I can no longer ask money from him. Can I ask money? I can ask money only when the share is with him. If I snatch the share also, ask the money also, that guy will scold. He won't give. So reversal entry or forfeiture entry will be share capital account debit to share forfeiture to calls in arrears. I have a question. By what amount will I debit share capital? To the extent amount is called up. Very good. By what amount will I credit share forfeiture? Paid up to the extent they have paid. To the extent they have not paid, I will credit calls in arrears. Share capital account debit called up, share forfeiture account credit paid up, calls in arrears credit unpaid. Everybody got this? Very good. I have an example question. In this, we'll try and identify whether reissue possible or reissue not possible. Whatever the shares which are forfeited can be reissued by the company. Can it be reissued? Yeah, even if there is no bond, I take it back from you, but I can give it to somebody else. When I give it to somebody else, I have to reissue at minimum price such that overall money of nominal value is correct. Can the reissue happen at par? Yes. Can the reissue happen at premium? Yes. Can the reissue happen at discount? Yes. Up to the amount previously collected, I can give discount. Up to the amount previously collected, I can give discount. We're like, sir, but you only told shares cannot be issued at discount. I am right. Shares cannot be issued at discount. Reissue is not issue. Reissue is like sale. Reissue is like sale. There can be a true or false question also on this. Remember, reissue of shares is like sale. Reissue of shares is like sale. Can you sell a share at discount? Of course, yes. But it doesn't matter. Old shareholder, new shareholder, everything together. You have to collect nominal value. It doesn't matter old, new, everything together. It has to be covering what? Nominal value has to be covered. You can't collect lesser than that. Are you getting it? 10 rupees share. Old shareholder paid 8. 2 rupees he did not give. I forfeited. On reissue, I should minimum collect 2. If I collect 2, that means I issued a discount of 8. 8 rupees discount allowed. 7 rupees allowed. 9 rupees not allowed. If I give 9 discount, new shareholder will collect 1. Old shareholder will pay 8. Together it becomes 9. Nominal value is 10. No. I have to minimum collect an amount such that total money collected will be equal to nominal value. Minimum. Are you getting it? See this question. Nominal value is how much? 10. How much did the old shareholder pay? On application he paid 3. On allotment he paid 1. So together we've collected how much? 4. What have we not collected? 6. On reissue, minimum money that I should collect is 6. Minimum money that I should collect is on a 10 rupee share. If I collect 6, how much discount did I offer? 4. Why did I offer 4 rupees discount? Because I've already collected 4. Because I've already collected one logic. I'll repeat. How much have I already collected? 4. How much did I not collect? On reissue, how much is the minimum money I should collect? Why 6? Because already I've collected 4. 6 plus 4 will become. Can I reissue at 7? Can I reissue at 8? So more than 6, no problem. Can I reissue at 5? Why? If I collect 5, old shareholder has paid 4, new shareholder will pay 5, together it will be like 9, which is not 10, which has to be 10. Are you getting it? Or in a different logic, how much has the old shareholder paid? 4. I will offer 4 rupees discount. Maximum how much discount can I offer? Can I offer 3 rupees discount? 2 rupees? 1 rupee? No discount. But maximum discount is Are you getting it? Okay, have a look at this question. Will you help me with this? Let's see this. Help me. How much have we already collected? How much have we already collected? How much is arrears? What have we done? Forfeiture. Now help me. In each of the cases, is reissue allowed or not? Will you help? Reissue price is how much? 10. How much is the amount previously collected? Okay. How much is the amount totally collected now? 40. Nominal value is reissue allowed. How much did I previously collect? 4. On reissue, how much did I collect? 12. 12. On reissue, how much did I collect? Listen to my question and then answer. Totally collected. Nominal value. Have I collected minimum nominal value? Reissue is allowed. How much have I collected from the old shareholder? 4, 3 and 10. How much have I collected from the old shareholder? On reissue, how much did I collect? I want you to answer but. On reissue, how much did I collect? Together. Nominal value. Is it more than 10? Reissue is allowed. Old shareholder before forfeiture paid how much? On reissue, new shareholder paid how much? Together I have collected. Nominal value. 1 rupee extra only we have collected. Is reissue allowed? Yes. Old shareholder had paid how much? 4. Very good. New shareholder on reissue paid how much? Together I have collected how much? Nominal value. Very good. Have I collected at least nominal value? Is the reissue allowed? Yes. Then come to next one. How much has the old shareholder paid? Very good. On reissue, how much did we collect? Together we've collected nominal value. Have I collected at least 10? Reissue is not allowed. You cannot reissue at 5. You have to reissue minimum at 6. This is one way of seeing the answer. Same answer I taught you one more logic. Yeah. Reissue price is 10. Nominal value is 10. Discount allowed is 0. Based on our old shareholders payment, we'll decide maximum discount. How much did the old shareholder give? How much did the old shareholder give? I will say maximum discount is 4. How much is the maximum discount I can allow? How much is the discount I allowed? Is it reissue allowed? How much did the reissue? How much is the money I collected on reissue? 12. Nominal value. Discount allowed? 0. Maximum discount that I could have allowed? 4. Is it within limit? Reissue is allowed. Reissue is, are you getting it? Is this very fast? Okay. What is the reissue price? Nominal value. Discount. 1. What is the maximum discount? Is the discount allowed within limit? Reissue is allowed. Reissue is, come to next one. Reissue price. Nominal value. Discount allowed. Maximum discount. Is it within limit? Is reissue allowed? Reissue price. Nominal value. Discount. Maximum. Within limit. Exactly up to limit. Is reissue allowed? What if the reissue price is 5? Nominal value is 10. Discount allowed is maximum discount that we should have given. Is it within limit? Not within limit. Reissue not allowed. Same thing we did here also. The perspective is different. Answer is same. Then we have a small confusion. When is it profit? When is it premium? When is it profit? When is it premium? Answer is simple. If you collect more than nominal value on reissue, it is premium. When you collect more than nominal value on reissue, it is premium. When you collect more than nominal value overall, it is profit. Old shareholder plus the new shareholder, together you collected more than nominal value, profit. Exclusively from the new shareholder, you collected more than nominal value, premium. 10 rupees share, if you reissue it at 12, premium 2 rupees. 10 rupees share, if you reissue it at 12, 2 rupees premium gone. Other than premium from new shareholder, you collected 10. From the old shareholder, let's say you collected 6. 6 plus 10, you had collected 16 from the same share. Nominal value is 10. 6 rupees is profit, 2 rupees is premium. Are you getting it? Totally, you collected 6 from old shareholder, 12 from new shareholder. You collected 18. In 18, 2 rupees premium, 6 rupees profit, 10 rupees nominal value. Too much to handle. Read this line. I'll make you do an example. Profit and premium. If amount collected from the old shareholder and new shareholder excluding premium exceeds nominal value, then it is profit. How about premium? If the shares are reissued at a price more than nominal value, it results in premium. Do you understand? Okay, come on. Let's quickly see this question. Do you see the question here? We'll discuss this at large. Okay, what is nominal value? Amount called up, amount paid up, amount arrears. So 10 rupees share, I've called the shareholder to pay full 10, is paid 7, is not paid 3. 10 rupees nominal value share, called up full 10 rupees, shareholder has paid how much? 7. How much is in arrears not paid by the shareholder? 3. Okay, shares were forfeited and reissued. Shares were and compute premium on reissue and profit on reissue in following case. Shall we do it? Reissue price is 10. Is 10 equal to or more than nominal value? Nominal value is 10, no? Nominal value will not change, yeah? Nominal value is 10. Okay, reissue price is equal to nominal value. Is there premium? No. Reissue price is more than 10. Is there premium? Yes. How much? 2. Reissue price is 9. Nominal value is 10. Can I say nominal value is more than reissue price? Or can I say reissue price is lesser than nominal value? Am I right? Is there premium? No. Next one. If reissue price is 5, nominal value is 10, which is more? Nominal value is more. Is there premium? If reissue price is 4, nominal value is 10, which is more? Nominal value. Is there premium? No. What if nominal value is 10 and reissue price is 3? No premium. And 2, no premium. Are you getting it? When will there be premium on reissue? When the reissue price is more than nominal value. When reissue price is more than nominal value, then there is premium. You understood premium portion? Now we'll learn profit. Shall we learn profit? Nominal value is how much? Amount called up. Amount called up. Amount paid up. Amount unpaid. I forfeited the share. I forfeited the, did I return the 7 rupees what you had given back to him? So I have the share with me. I also have 7 rupees. I have the share with me. I also have, what is the minimum money that I should collect now? If I collect more than 3, profit. If I collect up to 3, why? Already collected 7. Now if I collect 3, 10 nominal value, good. If already collected 7, if I collect 4, together becomes 11, 1 rupee profit because nominal value is 10. That 1 rupee is not premium, profit. I'll explain. Reissue price is how much? 10. Okay. Excluding premium also 10. How much was paid by the old shareholder? Very good. Total amount collected is Henge, old shareholder had paid 7. New shareholder paid 10. Together I have collected 70. Nominal value is how much? 110 rupees share I have issued and then I have collected 17 rupees. 7 rupees that I have collected extra should not go to share capital. It is profit. This profit should go to capital reserve. This is reserve arising in a capital transaction. This is reserve arising in a capital transaction. Let's take a pause here. Help me understand. How much did the old shareholder pay? Same share I forfeited from him. I gave it to somebody else. How much did the new shareholder pay? So for the same share, old shareholder paid 7, new shareholder paid 10. For the same share, old shareholder paid 7, new shareholder paid 10. Together I have collected 17. How much have I collected? Nominal value is how much? For 10 rupees share, I have collected 17 rupees. For 10 rupees share, I have collected 7 rupees. What I have collected extra? Is it security premium? No, it is profit on reissue of forfeited share. It is profit on reissue of forfeited shares. Where will you transfer it to? Capital reserve. Where will you transfer it to? Everybody understood? Fantastic. Come to the next one. Reissue price is 12. Reissue price is, in that excluding premium, nominal value is 10. 2 rupees will go to security premium. How much did the new shareholder pay? 12. How much did the new shareholder pay? In the 12, how much is nominal value? 2 rupees is security premium already gone. So what is the money paid by the new shareholder towards capital? 10. How much has the old shareholder already paid? Very good. Together we've collected nominal value 10. Extra collected 7. Profit. Next case, you collected 9. How much is money collected from reissue from the new shareholder? 9. How much have you collected from the old shareholder? Together you collected 60. Nominal value, how much have you collected extra? That is profit. Is there any premium here? No. Individually, from the new shareholder or from the old shareholder, if you have collected more than nominal value, then it is premium. Individually, from the new shareholder or the old shareholder, if you have collected more than nominal value, it is premium. Together, if you collect more than nominal value, it is profit. First eliminate premium and then find profit. First premium, then profit. Are you getting it? Why are we eliminating premium and profit? Capital matra irbeku. We should not include security premium or capital reserve in capital. Security premium and capital reserve are reserves and surplus. They are not part of share capital. I don't know. Are you getting it? Is this very fast? Nice. Come on. Next one. 5. Old shareholder paid how much? 7. New shareholder. Together. Nominal value. 2 rupees extra is profit. Okay. Leave this 4 and 3. Come to 2. How much did the new shareholder pay? Old shareholder paid. Together. Nominal value. Profit. Loss. Loss cannot happen. If you buy and sell goods, you can make loss. If you issue share, how can you make loss? No. Loss on issue of shares is not a concept. You started the business. You are raising the capital. Loss. How can it happen? No, not allowed. Are you getting it? So, issue of shares at discount is not allowed. You have to collect minimum 10. If you have to collect 10, old shareholder had paid 7, new shareholder must pay 3. If he pays 2, can you issue? So at 3 it is possible, at 4 it is possible, at 2 it is not possible. If you reissue at 3, you neither make profit nor make loss. But is it allowed? Yes. But at 2, you are going to make loss, which is not allowed. Did you understand profit and premium bifurcation? On reissue of shares, what is the journal entry? Bank account debit to share capital. I have a cute question. Journal entry on reissue is bank account debit to share capital. Same entry. Leave this. Bank account debit reissue price, share capital account nominal value. If there is premium, credit security premium. If there is premium, credit security. If there is discount, debit share forfeiture. On reissue, what is the entry? Bank account debit to share capital. If there is premium, to security premium. If there is discount, share forfeiture debit. Can I ask you a question? Can I write bank to share application to share capital, share allotment to share capital, bank to share allotment? Why not? Reissue also will make application allotment call. Can I make? Can I not make? Why? It is like sale, I agree. But can I make it in installments? Again, these shares I'm reissuing. No. Reissue also I'll do application, allotment, call. Can I do or not? If not, why? Okay, I'll bring you back to the other question. You forfeited the share. I will make you answer the question. Now you will only answer the question. Correct answer. I forfeited the share. Why did I forfeit? You should always go backward. I'm asking you why not stepwise on reissue. Why are we doing reissue? Because we forfeited. Why did we forfeit? Because they did not pay money. Then don't give it to them. No. Why did you give it to them? We don't know. We did not know that they will not pay. We thought they are good people. We thought that they will pay. So we gave. When we gave, what did they do? They firstly were good. They paid application. They paid allotment. Call bandaga kai kotru. When we made the share call, they did not pay call money. Now you learnt your lesson. You want to do the same mistake again? Again you do application, you receive money. Again you do allotment. Again share call, show gone. Again cheated. Again go to application. Again you call again. Company's hobby book they will write. What are your hobbies? Forfeiture, reissue, forfeiture, reissue, forfeiture, reissue. No. First time you done your mistake, you learned your lesson. Second time when you go for issue of shares, you don't want to do application allotment nonsense. You're like, cash you do item tago. Then you will say, no, no, I'll pay another. Oh, I've seen. I've heard people like you. Because of people like you only, I'm in this state. If not, I would have been doing business. I'm doing this forfeiture and reissue because someone came like you, smiled, gave money, and they told they'll give later. Later, they gave hand only. Now, I don't want to do that mistake. You got what I'm trying to tell? So, the company will not break it into installments on reissue because, firstly, it's already late. Nextly, they don't want to go through the entire cycle again of forfeiture reissue. So, on reissue, full cost kodu mama, amel item. Don't talk to me without keeping the money. You understood? Let's go to the next part. In a minute. I hope you understood this. Yeah, discount on reissue cannot exceed the balance in share forfeiture. We can't give more discount than what is already collected. And after you reissue, any balance remaining in share forfeiture will be transferred to capitalism. Same thing, profit what we learned. Old shareholder paid 7, new shareholder paid 4. Together we have collected 11. 1 rupee collected extra profit. Old shareholder paid 7. 7 rupees discount I can allow. From new shareholder if I collect 4, I allow discount of 6. I could have allowed discount of 7. When I give 6 rupees discount in the place of 11, sorry 7, 6, 7, 1 rupee extra collected, profit, transfer to capital reserve. Are you getting the logic here? Say something. Fantastic. You would have to read these two lines. Then we'll do Tera, Choda, Pandra. You need to know also how to do the entry for non-cash consideration. You give asset, you purchase asset, you give shares. Write the entry asset to vendor, not debtor, vendor. You should not write debtor, you should not write creditor. Debtor and creditor is only for goods. Debtors and creditors is only for goods. You cannot write creditors. You should write creditors for assets or you should write vendor. Entry for purchase of asset. Asset account debit to vendor. Then vendor account debit to shares. You can write application allotment call also. No problem. Now, forfeiture entry if premium is not received. If in case from the shareholder you have made the premium to be received, he has not paid the premium. Then what to do? In the forfeiture entry, where you write share capital debit security premium. I'll repeat. What is the forfeiture entry? Share capital account debit to share forfeiture. Am I right? Two call scenarios. There, if the premium money what you had asked from the shareholder, if he has paid, good. If he has not paid, reverse it by debiting. Reverse it by debiting in the forfeiture entry. Are you getting it? Security premium. When we made the share allotment, I've written the entry share allotment account debit to share capital to security premium. I've asked for premium. I've asked for premium. First say yes. He did not pay allotment money. Then I'll do forfeiture. Then I'll debit share capital account debit to share forfeiture to call scenarios. There I have to debit security premium also. Are you getting it? However, I had asked him for security premium in application. He had paid application money. Bank account debit to share capital to security premium. Received. Allotment, he did not pay allotment money. Now on forfeiture, I don't have to debit security premium. Will you include security premium in forfeiture entry? Question mark. Depends. I will tell. I'm asking question step by step. Will you include security premium in forfeiture entry? Question mark. Answer depends. Two possibilities. Possibility number one. If you have already collected the security premium money, should you debit it? You have collected it, you will not refund. If you have not collected, then it will be debited to reverse the wrong credit given in the past. I hope you understood. There's something. That is what we have done here. Premium is at application stage. Here premium is at call stage. Here premium is not collected. Here premium is already collected. I make you do those questions there. If premium is received, call scenarios doesn't include premium. No need to reverse. If premium is not received, call scenarios will include premium. So we have to reverse it in forfeiture entry. See this? Premium on forfeited shares. Premium is received. Then premium is included in sorry, premium is not included in calls in arrears, no need to reverse. If premium is not received, calls in arrears will include premium. Then you have to reverse. Say something. Very good. If calls in arrears doesn't include, don't reverse. If calls in arrears include, reverse. Done. Then I don't think we'd have to waste our time and energy on this. Do you want me to do this question? Premium received, premium not received. Okay, cool, cool, cool. We'll do a lot of 3-4 AQs there. And then. You understood forfeiture and reissue? I think by this we can say we have successfully completed forfeiture and reissue portion. Yeah, that second, third unit is done. Yeah, reserve capital and capital reserve are not same. Now there is no concept of reserve capital anywhere in Companies Act, so it's some outdated question. I've just put it because someone asked, but don't have to worry. There is no concept of reserve capital. Capital that we called by the company only in the case of dissolution. Ah, no, that is not there. Capital reserve is there. What is it? Profit which is in capital nature, which will be transferred because of excess money collected from the old shareholder plus new shareholder. Cool, Baba, cool. Let's go to debentures. Debentures. Company wants money. Company can collect money by issuing shares, but company need not collect money only by issue of shares. Company can collect money by way of debt. Debentures are acknowledgement of debt. Company wants money. Company collected money. In return, company did not give share. Company gave a document saying that yes, I owe you money. Yes, I've collected money from you. That document which the company will issue saying that they've collected money is called as debenture. What is it called as? What is debenture? Debentures are acknowledgement of debt. What are debentures? Acknowledgement of debt. There are varieties of debentures. Fixed debentures, floating debentures, convertible debenture, non-convertible debenture, first debenture, second debenture. There is no concept of irredeemable debentures. Under the old Companies Act, there was a concept of irredeemable debentures. Now, every debenture which is issued should be redeemed. Minimum 5, maximum 20. Additional period of 10 years is allowed for infrastructure development companies, but no company can issue irredeemable debentures. I think we can skip this types of debenture part. Fixed means a specific asset is mentioned that if in case I don't pay money, you can take this asset. Floating means I have not told any specific asset. Yeah, they can take any asset of the company. But remember, there can be no unsecured debenture. Always the debentures are secured. Always the debentures are, if you're still reading unsecured debenture or irredeemable debenture, that book is outdated. Yeah, don't read from such book with tells. That was the book from which your parents read. Okay, parents if they were doing CA. Then, unlike shares, debentures can be issued at par. Debentures can be issued at premium. Debentures can also be issued at discount. I'll repeat, unlike shares, debentures can be issued at par, debentures can be issued at premium, debentures can also be issued at discount. Everybody understood this? If in case there is discount on issue of debentures, it is like you are collecting 90 rupees and you will pay them 100 rupees later. If you take 100 rupees loan, you should give them 100 rupees. If you collect 90 rupees from them, that is by giving them 100 rupees certificate. On later redemption, you should pay them 100. No, that 10 rupees that you pay extra, it is in the nature of interest. It is not in the nature of capital expense. So, any discount on issue of debentures will be called as loss on issue of debentures. And that loss is not transferred to P&L account immediately. That loss is transferred to P&L account over the period of debentures. I'll give you the reason why someone does this. Very simple. I am a company, I am issuing debentures. You are a company, you are issuing debentures. Both of us are fighting, not just in selling the goods, we are also fighting in raising the money. I will tell debenture holders, I will give 6% interest. What will you tell? 7%. I will tell 8%. 10. SEBI is looking at us. Again, Nilso, you can't issue at such a rate. 11% priest. I'm just giving you an example. 11% priest. I can't issue debentures at a price more than 11%. You also cannot issue at cannot issue at an interest rate more than 11%. So blockade. No, I come to 11%. You come to 11%. Now, how do we compete? I will tell 100 rupees debenture in my company issuing to you at 90 rupees only. So you give 90 rupees today, collect 100 rupees after 5 years. And every year, I'll give you 11 rupees interest also. So that 10 rupees I'm giving them as a discount, which I will pay them later. So today they'll give me how much? 90. After 5 years, how much will I pay them? 100. That 10 rupees what I pay extra after 5 years, no, than what I've collected. That discount, it is not the expense in the year in which it is issued. It is not the expense in which year in the year in which it is redeemed. It is expense for the entire period. That 10 rupees is transferred to P&L account in year 1, 2, 3, 4, 5. In year 1, 2, 3, 4, 5, all 5 years. I'll transfer it over all 5 years to PL. You understand this? Say something. Why? That expense is incurred to issue debenture. Debenture ಇರೋವರೆಗೂ expense ಇರುತ್ತೆ. Debenture is there for 5 years. Expense should be written over 5 years. Are you getting it? Second point. On redemption of debentures, meaning taking the debenture back from the debenture holder and giving him the money. I can pay nominal value. I can pay premium, or I can give discount also. Discount you leave it, usually not possible. But if I promise to pay him premium, 100 rupees debenture, on redemption, I'm promising to pay 105. 5 rupees what I pay extra. 5 rupees what I pay, that is premium on redemption of debentures. That is also loss on issue. What is loss on issue of debentures? When you are collecting, if you collect less, or when you are paying, if you pay more, together it's called as loss on issue of debentures. What is loss on issue of debentures? Discount when you are collecting, premium when you are paying, together loss. So loss on issue of debentures is discount on issue of debentures plus premium on redemption of debentures. I'll repeat, loss on issue of debentures is discount on issue of debentures plus premium on redemption of debentures. Doid plus POD. Doid, POID. What is DOID? Discount on issue. PORD, premium on redemption. Together is called as LOID. LOID. LOID, total amount is to be identified at the time of issue. When is premium paid? On redemption. When is premium paid? But I need to make the provision today when I'm issuing. 5 years later, I'll pay 10 rupees extra. Today only I should book that 10 rupees and book it as expense over 5 years. 2 rupees first year expense, 2 rupees second year expense, 2 rupees third year, 2 rupees fourth year, 2 rupees fifth year. Payment 10 after fifth year. Are you getting it? So how do we find discount on issue of debentures? Nominal value minus issue price. How do we find premium on redemption of debentures? Redemption price minus nominal value. Together we call it loss on issue of debentures. Help me with some basic things here. We'll do some basic AQs. Help me here. Yeah, nominal value 10, issue price 10. What is this? Is it issue at par, premium or discount? Is there loss on issue? No. Nominal value 10, issue price 11. Premium. Is there loss on issue? No. Premium on issue. We have collected more. Premium on redemption is loss. Discount on issue is loss. When you are collecting, if you collect less. When you are paying, if you pay more, it is loss. When you're collecting, if you collect more, it's not loss. When you're paying, if you pay less, it's not loss. Are you getting it? When you go to someone's house, you're taking something to give. When someone is coming home, you're giving them something and sending. Then it is loss. Okay, help me with this one. 10 rupees nominal value issued at 9. Discount. This is loss. How about nominal value 10, redeemed at 10, redemption at par? Is there loss? Nominal value 10, redeemed at 11. Loss because it is a premium. Nominal value 10, issue price 9. Is there loss? Pakka. Make some noise. Very good. Come to the next one. Identify discount on issue and premium on redemption. Okay. Nominal value, issue price, redemption price. All of it I've given. Is it too close? Too many numbers to see? Can you process? Help me in the first case. Is there any discount on issue in this case? No. Is there any premium? Here, second one. Is there any discount on issue? No, there is premium on issue. On redemption, there is no par, sorry, no premium, no discount. Par, basically 0, 0. In this case, is there any discount on issue? Yes, 1 rupee discount on issue. Redemption is at par. Next case. Nominal value 10, issue price 10. Discount on issue? No. Premium amortization? How much? 1. How about next case? Discount on issue? No. Premium on issue, premium on redemption. Discount on issue is 0. Premium on redemption is 1. I hope you're getting it. This discount on issue plus premium on redemption together will become loss. Together will become very good. So the journal entry will be somewhat like this. You will debit the money collected. You will credit the debenture account. You will debit the money collected, you will credit the debenture. If you have collected premium on issue, that will be credited to security premium. Are you getting it? If there is discount on issue, that will be debited to loss on issue. If there is any premium to be paid on redemption, I will add it to this loss here and I will also credit it to premium on redemption. This premium on redemption here is there, no, this is provision created. When am I paying premium on redemption? On redemption after 5 years. But today I create provision, but I pay it after 5 years. Today I create provision, but pay it after 5 years. Conservative approach. And this loss will include two things. One, discount on issue. Two, premium on redemption. Both the discount on issue and premium on redemption together is transferred to P&L account, not in 1 year, over the period of debentures. Can't we? How do you split? Then entry will be bank debit, loss on issue debit, 2 X% debentures. Then loss on issue of debentures again debit, 2 premium on redemption. Suggested not to. Suggested not to. If there is any discount on issue and there is premium on redemption, add them both together and write it in loss on issue of debentures. Add them both together and write it in loss on issue of debentures. I hope everybody understood. Fantastic. Discount on issue plus premium on redemption together will become loss on issue. It has to be transferred to P&L. How do we transfer to P&L? Let's say the debentures are to be redeemed, like redemption part is after 5 years. How do you transfer to P&L account loss on issue of debentures? Divided by? Wrong answer. It's not divided by 5. It is in the pattern of depreciation. It's in the pattern of debentures outstanding at the beginning of the year. It's in the pattern of debentures outstanding at the beginning of the year. I'll repeat. Let's say you issued 1000 debentures. How many debentures have you issued? All 1000 debentures are to be redeemed after 5 years. All 1000 debentures have to be redeemed after. How many debentures are outstanding in year 1? 1000. Second year, 1000. Third year, fourth year, fifth year. Ratio is 1 is to 1 is to 1 is to 1 is to 1. So you transfer equal amount. I told you something in the beginning. Loss on issue of debentures is in the nature of interest. Is in the nature of higher the loan, higher the interest. Lower the loan, lower the interest. If you repay loan little every year, will the interest be same? No, because the loan amount decrease, interest will decrease. Same way, if debentures are redeemed little every year, outstanding debentures are decreasing, transfer to PL also will decrease. What if debentures are same? Loss on issue of debentures transfer to P&L also will be same. Don't ever divide by 5. The problem with you all is some place you will apply some illogical shortcut which will give correct answer. I am agreeing that is giving correct answer, but I am damn rude and I am honest and correct in telling that it is illogical. Because you apply that illogical shortcut there you survive. I am not telling you go wrong there. Other place you will go wrong. So apply logic. Don't tell equal. How do we transfer? In the basis of outstanding debenture. The basis of outstanding debenture. Now focus on this. Is similar to interest on debentures. Sir, how comes whatever you told is only I only made this? No. I would have put what I told only. Yeah. Loss on issue of debentures is similar to interest on debentures. Like interest is charged to P&L account every year. No. Loss on issue of debentures is also transferred to P&L account over the entire debenture life. Now observe this. Case scenario, nominal value 10, issue price 10. Is there discount on issue? No. Is there premium on redemption? Second case, nominal value 10, issue price 11. Premium, how much? 1. Here there is redemption is at 10. par. So I don't think I should spend time and energy on journal entry. Journal entry part you will handle. Pakka? Okay. Then I'll go to the treatment of loss on issue of debentures. I told you no, over the debenture period to P&L in what ratio? Remember the word outstanding debenture ratio. Every year you compute how much debentures is outstanding. Every year you compute how much debentures is in that ratio you transfer. If outstanding debentures is same every year, equal amount will get transferred. Not divided by 5. Because outstanding debentures are same, the same amount will get transferred. What if 1000 debentures were there? Every year you redeem 200 debentures. Then what will happen? First year there is 1000 debentures. You redeem 200, second year 800, third year 600, 400, 200, 0. Then the ratio of these debentures 10 is to 8 is to 6 is to 4 is to 2, 5 is to 4 is to 3 is to 2 is to 1. In that ratio we'll write off now. Are you getting it? It can so happen that first year, second year no redemption, third year beginning you redeem 200, fourth year no redemption, fifth year beginning 200, sixth year no redemption, seventh year beginning 200. Then identify that outstanding debentures and then take the ratio. Don't blindly do 1 by 5. Don't blindly do 5, 4, 3, 2, 1. Company can tell no, every 2 years I'll redeem 100 debentures. Can they tell? Yeah. Okay. Focus. We'll see one beautiful question. Nominal value. Issue price. Premium is there. Leave that premium. That will go to security premium. Redemption price. How much is loss on issue? Wrong. So cute. You collected 12, you paid 13, 1 rupee loss. Illa. Security premium go to there too. What is the nominal value? What is the redemption price? Loss is 3. Loss is, I knew it. And, oh my god, I don't know how do I go right. I don't want to go right in this. I don't get any pleasure by you getting wrong answer. But cute, huh? Yeah. So opening balance, sorry, nominal value 10. Issue price 12. 2 rupees will go to security premium. Nominal value 10, redemption price 13, 3 rupees per debenture, premium on redemption will be loss on. This 3 rupees multiplied by 10,000 debentures is how much? 30,000 will be loss on issue of debentures. See here, 3 rupees, 10,000, 30,000. This 30,000 total loss should be transferred to P&L. Yes or no? In what ratio? Outstanding debenture ratio. Case 1. All debentures are redeemed at the end of year 5. When are we redeeming debentures? Year 5. So, year 1, 10,000. Year 2, 10,000. Year 3, 10. 4, 10. 5, 10. Redeemed 0, 0, 0, 0, 0. Year 5, we redeemed full 10. I'll take the outstanding debentures at the beginning of the year as ratio. 1 is to 1 is to 1 is to 1 is to 1. I'll split in that ratio. You straight away told 1/5. So here you will go wrong. I'm telling you here also you should remember that this is the entire game. That is the reason it's 1 by 1. Got it? In the second case, 1/5 of the debentures are redeemed at the end of each year. Meaning, first year we have 10,000. Am I right? You redeem 1/5. 10,000 into 1 divided by 5. 2000 is redeemed, closing is 8. Next year, opening 8, redeemed 2, closing 6. Opening 6, redeemed 2, closing 4. Opening 4, redeemed 2, closing 2. Opening 2, redeemed 2, closing 2. Don't take ratio of this. No, 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 not closing. Opening ratio. 10, 8, 6, 4, 2, 5, 4, 3, 2, 1, 5 by 15, 4 by 15, 3 by 15, 2 by 15, 1 by 15 of the total amount of loss on issue. Are you getting this? Make some noise. Akka. This should be transferred to P&L account every year as expense. This is what I would want you to know when it comes to issue of debentures. Yeah, few more problems to be practiced on this, and you will be really good at this. Something cool. On these debentures, before redemption, you have to pay interest. When you pay interest, what is the entry? Interest is expense. Interest account debit, bank account credit. Interest account debit, bank account credit. I'll explain this collateral security next. Ask me later. We'll do that collateral security part slightly later. I'll finish your TDS part. Okay. See, you are company here. You are not the investor. Who are you? Company. You collected the money. You given them debenture. You collected the money. You given them debenture. Because you have taken debt, you need to pay them interest. Interest will be paid by the company. And on this, This person who earns the income should pay tax to government. Who are you? Company. Who are you? On the money that you have taken as loan, you pay interest to the investor. It is income to the investor. It is expense to company. You agree with me? Interest is expense. Interest is expense to company. It is income to investor. Because it is income. On income, you should pay income tax to government. Are you getting it? Now, in a company, there are 1000 debenture holders. How many people should pay income tax? 1000 debenture holders should pay income tax to government. For company, it is easy to pay interest to 1000 debenture holders. For government, it is difficult to collect tax from 1000 debenture holders. They would have to track down all 1000 of them. So, government is telling the company to pay the tax on behalf of this investor directly to government, rather than me giving income to the debenture holder, he paying interest to government, he paying tax to government. What the government is asking me only to pay. So that way, government can collect tax on 1000 people's income directly from company. If not, I will give it to 1000 people. 1000 people should pay to government. You understood? The source of income is here. End destination of income is here. Government is collecting the tax at source, where the income is getting generated, there only they collect. Are you getting it? So me as a company, I will pay interest to debenture holder after deducting the tax. Let's say 1000 rupees is interest income to this guy. Usually how much do I pay? I pay him 1000, he should pay tax. TDS, what will happen? In 1000 I will deduct tax. Let's say tax is 100 rupees. In 1000 rupees, income to this guy is 1000, but I pay him only 900. 100 rupees what actually belongs to him, I will pay directly to government in his name. I will give it to government directly in his name. It is this guy's money. It's this guy's PAN. Take this guy's PAN, take this guy's name. On his behalf, I am only paying. It will be easier for government. That is tedious. Understood? Entries will be very simple. Debenture interest expense debit. Credit debenture holder because I need to pay. But I won't pay him full money. I'll deduct TDS and then pay. TDS portion will be paid directly to government. Entry will be debenture interest debit to debenture holder to TDS. To TDS. TDS is liability, but not towards the debenture holder. TDS is liability, the money to be paid directly to government. Next, when I make the payment, debenture holder account debit to bank. I'm paying the money. Am I right? I pay the debenture holder interest minus TDS amount. I pay the debenture holder interest minus TDS amount. TDS amount I pay to bank. TDS to bank. Are you getting it? This interest amount, whatever is there here, will be transferred to my P&L. This is the entry for TDS portion. I hope you got it. The next point that I wanted you to notice with regard to collateral security. What is collateral security? I go to bank and I ask for loan. Bank asks for some security. I should give some asset, no? But I don't have any asset. Bank will tell I will not give you money. Then I'm thinking of issuing debentures. But to issue debentures, the process is very long. Process is very long. So I will go to debenture. I will go to my bank and I'll strike one deal. I will tell my bank, you give me loan. You give me loan. I don't have any security to give. I will give you debenture document, but keep it a secret. Don't tell anyone that I've given you this. This is actually not debenture. This is like debenture. If I give you money, let this secret be secret. We'll tear that paper there. If I don't give you money, then tell everyone, and then that's a open debenture that I've given it to you. Are you getting it? I've taken loan from the bank. I should give some asset. No, I don't have any asset to give. All my assets are already pledged, or I don't want to give. Then what do? I will give a document as debenture. Actually, it is loan, but I've secretly given them a debenture. If I repay the loan, that debenture document will be torn. Nobody has to know. If I don't repay, then the debenture will become, that paper will become open secret. Everybody knows it. That will become debenture. Are you getting it? Are you getting it? So I am giving loan ಗೆ ಒಂದು loan security ಕೊಡ್ತಾ ಇದ್ದೀನಿ. Debenture is a liability. Loan is a liability. Liability ಗೆ security ಆಗಿ liability ನೇ ಕೊಡ್ತಾ ಇದ್ದೀನಿ. Liability ಗೆ security I should give asset, no. I should pledge asset for a liability. I have given liability as a pledge for liability. That is this collateral security. Understood? So what is the journal entry here? Firstly, you take loan from the bank. What is the entry for loan taken? Bank to loan. Bank to, you issued them debentures, no? You credit debenture, but nobody should know. Nobody should. You will debit one suspense. Suspense. Debenture suspense. Now you will tell, sir, but it will be there in balance sheet. Everybody will see. No. In the balance sheet liability side, you will write debenture X%. Inner column, I will write less debenture suspense, same amount, outer column 0. You understood? Once again, you taken loan. What is the entry? Bank account debit to bank loan. You give debentures as collateral security. What is the entry? Debenture account credit. Am I receiving anything? Nothing. Suspense. I'll write debenture suspense account debit to debenture. Sir, how is it a suspense, sir? When they say in the balance sheet, they'll understand. They will not. Why? This X% debenture will write liability. And this debenture suspense, I'll write deduction from liability, debit balance. Balance sheet outer column 0. Everybody will think it is bank loan. Now, what if I repay the loan? I promptly repay the, I'm company. What if I promptly repay the loan? Will reverse this entry. Bank loan to bank. Then they will tear the debentures. This entry also will get reversed. What is the entry on loan repaid? Bank loan to bank. Bank loan to, and then debentures to debentures. Once again, what is the entry when loan is taken? Bank to bank loan. What is the entry when debentures are given as collateral security? Debenture suspense to debenture. When the loan is repaid, reverse this. Bank loan to bank. What is the entry when debentures are returned? Debentures to debenture suspense. What if I don't pay? Then I did not credit bank, then they will not give debentures. If I pay them cash, they will give me debentures, I will take. If I don't pay them cash, they will not give me back debentures. Then what will it be? It will be bank loan to debenture suspense. Debenture suspense will get revealed. Bank loan will get cancelled. It has become debentures. What is the entry if loan is not repaid? Bank loan to debenture suspense. If I pay cash, I'll write bank loan to cash, debentures to debenture suspense. If I don't pay, bank loan to debenture suspense. I hope you understood. Not very difficult, not very tricky, very much doable. Yeah, don't skip this part. Let's start with the next unit, accounting for bonus issue and right issue. This is a CA inter topic shifted to CA Foundation from May 2024. I want you to remember bonus issue can be seen from two perspectives. Can be seen from two perspectives. One, from the perspective of company. Two, from the perspective of shareholder. In CA Foundation company accounts chapter, you have it only from the perspective of company. In CA Inter investment accounting, when you do this topic, you will see the same bonus issue from the perspective of shareholder. But today you will see it only from the perspective of the, very good. Now see it from the company's perspective. From the perspective of shareholder, so it is free. For company, it is capitalization of reserves. What is it called? Capitalization of reserve. What do you mean by capitalization of reserve? There is one balance sheet. There is share capital. There is reserves and surplus. There is one balance sheet. There is share capital. There is reserves and surplus. You take money from reserves and surplus, you shift it to share capital. You take money from reserves and surplus, you shift it to share capital. Basically, your reserves and surplus will decrease, your share capital will increase. Your reserves and surplus will decrease, your share capital will increase. Journal entry will be, in short, reserves and surplus account debit to share capital. You take it from, actually we have a long story, but I'm cutting it short. We take it from reserves and surplus, we put it to share capital. That's the difference between marathon and regular. Don't think regularly wine ಮಾಡ್ತಾರೆ marathon ಅಲ್ಲದೆ ಮಾಡ್ತಾರೆ. Nothing. In marathon, I'm giving you the cherry on the top of the cake. Cake ಬೇರೆನೇ ಇದೆ. A lot of them think, this only served to slowly. No. Okay. See, when we talk about reserve, we spoke about reserve. No, we take it from the reserve, put it to capital. What reserve can we touch? First, we will take capital redemption reserve. Which reserve will you take? This is given under section 63, which regulates with bonus issue. That will tell that we should take it from capital redemption reserve. After capital redemption reserve, if it is still not sufficient, we'll take it from security premium. Before I go to security premium, I want you to know what is capital redemption reserve. It is reserve created on redemption of preference shares or reserve created on buyback of equity shares. Whenever I redeem preference shares, capital decreases, Whenever I buy back equity shares, capital decreases. Decrease in capital is not allowed. Company's capital can only increase. It can never decrease. Company's capital can never decrease. It can only, when it decrease, we should create CRR. That CRR will be used to do bonus issue. So capital will come back to same level. Let's say the capital is 10 lakh. Company redeemed preference shares worth 1 lakh. Preference shares reduced by 1 lakh. Capital came to 9. Capital should not come to 9. When capital is coming from 10 to 9, I create 1 lakh CRR from pre-reserves. Using this 1 lakh, when I make bonus issue, capital will again come back to 10. So, I'm telling you a point which is not there in your CA Foundation syllabus, but you should always know balance in capital redemption reserve can be used only for bonus issue and nothing else. Balance in capital redemption reserve can be used only for bonus issue and nothing else. Can use it for any other purpose. Only bonus issue. When you only do bonus issue from it, capital will increase to the same extent where it has decreased. Got it? Next, you can take security premium. There is a condition. We'll come back to it. Then, if CRR and security premium is over, then we can take capital reserve. If capital reserve is also not sufficient, then I can take general reserve and P&L together, which is called as free reserves. First the CRR, then security premium, then capital reserve, then free reserves, which is general reserve and P&L. I hope you understood. Let's go forward. Security premium and capital reserve. There is a warning symbol. You must know. What is it? You can use security premium or capital reserve only if it is realized in cash. I issued shares, I collected cash. I collected cash more than nominal value. Call, okay. That extra money, call only, no bomb or something. Then okay. Share you issued for 10, but you collected 12. 2 rupees extra you collected is there in security premium. That 2 rupees can be used for bonus issue. But you purchased an asset from somebody. Against that asset, you gave shares at premium. Can you use that security premium to make bonus issue? You redeemed debentures. You redeemed by issuing them preference shares or equity shares. Basically converted debentures to equity shares. There you collected premium. Can you use that premium for bonus issue? No. You can use security premium to make bonus issue only if such security premium is realized in cash. Only if such security premium is realized in, you should have collected cash. You have not collected cash, but there is security premium. Can't use. Same with capital reserve. Capital reserve will arise in two situations. One, you forfeited the shares and reissued them at premium. When I say premium means extra price. Old shareholder had paid 6 rupees. He did not pay 4. You forfeited. New shareholders you should collect 4. You collected 5. Old shareholder paid 6. New shareholder paid 5. Together you received how much? 11. Together you received how much? You received 11 rupees. Nominal value is 10. Against nominal value of 10 when you collected 11, that 1 rupee I told profit to be transferred to capital reserve. This capital reserve is realized in cash. You collected cash. Can it be used for bonus issue? Yes. But you upward revalued your PPE. You remember revaluation of PPE upward? When you revalue it upward, PPE account debit to revaluation reserve, that revaluation reserve is capital reserve. Is it realized in cash? Can you use that for bonus issue? No. So whenever there is capital reserve, ask question. Is it realized in cash or is it not realized in cash? If it is realized in cash, you can use it for bonus issue. If it is not realized in cash, you cannot use it for bonus. I hope you understood. Very good. Then the next point that I want you to know should have been realized in cash. Who tells this? Section 63 of Companies Act 2013. Then capital. Can you make bonus issue to equity shares only or can you make bonus issue to preference shares also? There is no restriction in the law. You can make bonus issue to equity shares as well as preference. Yeah. Can a company make bonus issue to preference shareholders? Yes. There is no restriction. I've given an example where they have done bonus issue to preference shares. Okay, leave that. Let's proceed. Are you guys getting it? There is no restriction. You can issue. But all the questions that you do is bonus issue to equity shares. But does that mean only equity shares are entitled? Fine. Let's go forward. Then effects of bonus issue. What will happen when you do bonus issue? Share capital will increase, capital will decrease. earnings per share will decrease, net assets will not change, cash will not change. Liquidity in the market will increase, because of which cash flow doesn't change, and market price will get adjusted, averaged out. What are the conditions? When can a company go for bonus issue? In order to go for bonus issue, there should be power in the articles of association of the company to do so. Second point, board should recommend, and there should be a resolution passed in the general meeting taking approval from the members. Then the company can do bonus issue. To do bonus issue, shares should be fully paid up. If they are partly paid up, two options. One, make the call, collect the cash, and then make fully paid up shares as bonus to them. Second option, convert the partly paid up to fully paid up only by way of bonus. I'll repeat. Can you make bonus issue when the shares are partly paid up? Answer is no. What to do? Make share call, collect cash, make that shares from partly paid up to fully paid up, then you make fully paid up shares as bonus. Okay. Second option. What is the second option? Make the call, don't collect cash. Use the reserves and convert that partly paid up share to fully paid up by way of bonus. But in this case, there is a condition. Whenever you convert partly paid up share to fully paid up by way of bonus without collecting cash, you cannot use CRR and security premium. You cannot use CRR and security. You have to only use capital reserve, general reserve, and P&L. I hope you understood. Very good. No default should have been done in statutory dues. Company should have paid interest promptly, redeemed interest, redeemed debentures, and repaid deposits promptly. Only then the company can go for bonus issue. If they have not fulfilled these conditions, company cannot go for bonus issue. Got this? Then let's quickly see what are the types of bonus issue. I just mentioned no two types of bonus issue. Number one, issue of fully paid up share as bonus. Number two, conversion of partly paid up to fully paid up by way of bonus. Number one, issue of fully paid up share as bonus. Number two, conversion of partly paid up share to fully paid up share by way of bonus. I want you to understand this with ease. Whenever the shares are fully paid up in the balance sheet already, then we give fully paid up shares as bonus. When the shares are partly paid up, I have option. I can make the call, collect the cash, and then make fully paid up share as bonus, or make the call, don't collect cash, use my existing reserves to do bonus issue. If I use my existing reserves to convert partly paid up share to fully paid up by way of bonus, then I cannot use CRR. I cannot use security premium. I can only use capital reserve, general reserve, P&L. But for issuing a fully paid up share as bonus, there is no restriction. Use CRR, use security premium. Remember, order is also very important. You can't play with the order. Only when you finish CRR, you should go to security premium. Only when you finish security premium, you go to capital reserve. Only when that is also over, general reserve, and finally P&L. I hope you got it. Next one. What I want you to know after that is what is the journal entry. Issue of fully paid up share as bonus. I told you the reserve will decrease, capital will increase. Debit the reserves, that will decrease. Credit the capital, that will increase. But I can't write straight away reserve to capital. In between, I'll open one dummy account. This is to ensure that 2 years later also, if I want to know how many shares were issued as bonus or how much was issued as bonus, I should be able to track. How do I do that? Very simple. Debit reserves, credit bonus to shareholders. Debit bonus to shareholders and then credit share capital. By this, I'll be able to track how much bonus is made. What is the entry? Reserve to bonus, bonus to share capital. In this bonus will get cancelled. Reserves is debited, reserve is decreasing. Capital is credited, capital is increasing. I am justifying my definition. What is bonus issue? Capitalization of reserves. What is bonus issue? Capitalization of, I'm taking it from reserves, I'm adding it to capital. That's what I did. Reserves decrease, capital increase. What if I'm doing type 2 bonus issue? That is conversion of partly paid up to fully paid up by way of bonus. Same thing. First, I will make share call. Share call account debit to share capital. Then I need to collect money, but I won't collect money. What will I do? I use my reserves. Can I use CRR? Can I use security premium? I'll start with capital reserve, general reserve, P&L. Debit them, credit bonus. Then I'll debit bonus and credit share call. Instead of writing bank to share call, I'll write bonus to share call. You know what's happening by this? First I debited share call, then I credited share call at the end, nullified, zero, gone. Then share capital I've created, capital will increase. Reserves have debited, capital will reserves will decrease. Bonus credit, bonus debit will get eliminated. Again, what's happening? Capital is increasing, reserve is decreasing. Capitalization of reserves. What is happening? Capitalization of, I'm taking it from reserves, putting it in capital. In my balance sheet, liability side, under shareholders fund, there are three things: share capital, reserves and surplus, money received against share warrants. From my reserves and surplus, I'm shifting it to share capital. That's it. Within the balance sheet, I'm changing the heading for the amount. For that, I need to comply with law. I need to pass accounting. This is done usually by the companies in order to skip giving dividend. In order to skip giving, why? Dividend is taxable. If I give dividend, it will get taxed in the hands of the shareholders' income. Some people want money, some people don't. If I don't give dividend, relatively large set of audience will be upset. So what do I do? You have two shares, you give one share as bonus. Enjoy. Now you'll have three. Those of you who don't want money, you will keep three shares with you. Those of you who want money, that one share that I've given extra, you sell in the market, you realize money. So those who want money realize only they will pay tax. Not everyone has to pay tax. Instead, if I give dividend, company has profit. Instead of capitalizing the result, I give dividend to all of you. All of you are supposed to pay tax on the same. So instead of that, what do? I will give you share. That way, my cash also will not go out. If I give dividend, no, full profit gone out, cash went out. I have less investment. Again, I would have to issue shares and then collect cash. Why did I give cash as dividend? Why did I collect cash as capital? When I gave dividend, you paid tax. Again, I should collect cash. You take no. Instead, don't give cash. Give shares free. My share capital increased. Reserve stayed with me. Cash also did not change. You happy? I am happy. You want money? You sell the share. You don't want money. You keep the share with you. You don't have to pay tax also. Government is not happy with this. What did they tell? They paid one statement in Companies Act. They told bonus issue cannot be in lieu of dividend. Okay, you tell. I don't care. I will still do it. How can you catch me? You can't even scratch me. I will do whatever I want. They are telling you cannot tell that you will not give dividend because you give bonus issue. Government is telling that you cannot tell that you won't give dividend because you already given bonus issue. I will tell I had no intention of giving dividend. Actually, I had. I have given this bonus issue only because I have shares. Actually, I don't want to give dividend. That's my choice. You got what I'm trying to tell? So you can keep the shareholder happy without giving them dividend and without moving a single rupee cash, and you are also happy. In this entire transaction, government gets nothing, no tax. When will the government get tax? When you sell that bonus share in the market at a profit, then the government gets tax. Till then, no. Are you getting this? So that's with regard to bonus issue. Very, very important point. When they give bonus issue questions in the exam, they will ask or they might ask you to prepare notes to accounts also. They might ask you to prepare notes to accounts also. If they ask you to prepare notes to accounts, in the notes to accounts, you'll write share capital before bonus issue, how much is there. Below that, you add bonus number of shares. Am I right? Below that, you have to disclose how many shares are issued for non-cash consideration is a compulsory disclosure. You don't write this, leave 2 marks to the institute and then come. If in case you want full marks, whenever bonus issue has happened, mandatorily you are supposed to disclose how many shares are issued for non-cash consideration. Let's say 1 lakh rupees worth of shares are there, 10,000 shares of 10 each, 1 lakh. Company has issued 2,000 shares as bonus. In the balance sheet, you write 12,000 shares of rupees 10 each, 1 lakh 20. Below that, you should write out of the above 2,000 shares have been issued for non-cash consideration, disclosure mandatory. By this, we are done with bonus issue. Let's start the next unit in this topic of bonus issue and right issue. The second unit is basically dealing with right issue. Now, we've discussed in the past, bonus issue is issue of shares free of cost to the shareholders of the company. Right issue is not like that. In right issue, we gave shares to the existing shareholders only, but not free, but at a price. I'll repeat, bonus issue is issue of shares to the existing shareholders of the company free. Whereas right issue is issue of shares to the existing shareholders of the company at a price. Now you might say, sir, how is this different from any other issue? Accounting journal entry wise, it does not have any other significance. But theoretically, in order to answer your true or false questions or short notes questions or to compute your theoretical X right price, value of right, what is cumulative right price, to understand this concept, no, you have to know why does a company go for right issue. First thing to know is right issue means you have a right to buy. You have an option to buy. You are not obligated to buy. Let's say you are the existing shareholder of the company. I will tell you, because you are the existing shareholder, I will give you an option. If you want, you can buy more shares. Is it? If you want, you can buy, or I want money, you have to buy. If you want, you can. If you don't want, no force, you cannot buy. So company cannot create an obligation to the existing shareholder to buy. It's just an option. Let's see. As a shareholder, when you receive this option from the company, you have three options. One, you can buy the shares. Two, you can reject the shares. Three, you can give this option to somebody else so that they can buy. One, you can buy. Two, you can do nothing. Three, you can give your option to buy the share to somebody else so that they can buy. Are you getting the difference here? Among all the three options? Now let's see, why does a company go for right issue? Imagine a company by name Dholakpur Limited. What is the name of the company? Dholakpur Limited. So our Chota Bheem style. And in this company, the shareholding pattern is somewhat like this. How many shares are there in Dholakpur Limited? 20,000 shares. Among 20,000 shares which is there in Dholakpur Limited, 50% of the shares, which is 10,000 shares, are held by B. How many shares does he hold? Out of 20,000. Can I say he holds 50%? Okay. Next up, 7,500 shares are held by Chutki, 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 Chutki. How much will it come to? 37.5%. Nextly, we have, guess the next name. Not Raju. It's, the name is right. The way you're saying it is, it's not Raju. It's Raju, Raju. Raju holds so much shares. 2,500. And that comes to 12.5% of the shares. They're in their happy world. They hold 20,000, that is 50%, 37.5%, and 2,500 shares. How many shares does Raju hold? 2,500 shares. Now the company wants to increase its share capital. Company wants to increase its share capital. Dholakpur Limited is expanding. They want to issue how many more shares? 10,000 more shares. When they want to issue 10,000 more shares, if they give it to existing shareholders, it's okay. You know what will happen if they don't give it to existing shareholders? Dilution of the rights. What do you mean by dilution of the rights? Let me explain. Let's say this fresh 10,000 shares are not bought by the existing shareholders. There is no concept of right issue. You issued these shares outside and Khalia bought these shares. You know Khalia? The fat guy who doesn't wear shirt, he bought 10,000 shares. Previously, before this right issue, the shares of the company were 20,000. Now additional 10,000 are given. Totally, the share capital of the company is 30,000. In 30,000, Beam holds 10,000. Beam now doesn't hold 10,000 out of 20. He holds 10,000 out of 30. And that ratio will come to 33.33. Previously, how much was Beam holding? 10,000 out of 20. That was 50%. Now Beam holds 10,000 out of 30, which means the ratio has come to 33.33. Chutki was holding 7,500 shares out of 20,000. Her ratio was 33.33. Now she holds 7,500 out of 30,000. Do it, 7,500 by 30,000, what do we get? 25%. Lastly, Raju. Raju holds so much? 2,500. Raju was holding 2,500 out of 20,000. His share was 16.67. Now Raju holds 2,500 out of 30,000, which comes to 8.33. The new shareholder Khalia has come. How much does Kalia hold? Kalia holds 33.33%. Previously, Beam alone had majority stake in the company. If Beam says no, other people cannot take decision. Why? 51% at least you need, no? Number of votes for should be greater than number of votes against. If Beam says no, 50% is no. Decision not taken. Now, if Kalia, Chutki and Raju team up, Beam becomes minority. Beam holds 33.33, but others can take any decision which is against him. Are you getting it? So Beam has lost his power. Why? Company did not do right issue. What will happen in this case? Beam will lose his interest in the company. Beam will hate the company. Beam's and Chutki's friendship will get broken. Raju will no longer be friends with Beam. So we don't want something like this to happen. Not just in Dholakpur, but in every company. So in every company, the power in the hands of the people, they don't want it to get diluted. You should not let the voting power in the hands of a shareholder get diluted. So what is the observation what we've done recently? Percentage of existing shareholders control as diluted, and majority before issue ended up becoming minority after this issue. If you don't want something like this to happen, what should the company do? Right issue. To overcome this, they should do right issue. Right issue is option given to the existing shareholders of the company. What is right issue? Option given to the existing shareholders of the company to buy the shares of the company. The existing shareholders of the company will buy the shares. Only if the existing shareholders of the company don't buy, then we go to outsiders. If the existing shareholders only buy, the shares are not offered to outsiders. Now, if you do this, how much was Beam holding? 10,000 out of 20,000, 50%. Am I right? So, on this additional issue, what was supposed to be made, no, 10,000 shares. The company will give 50% of it to Beam. One share for every two shares. There were 10,000 shares. Sorry, there were, yeah, correct, no? There were 20,000 shares. Company is issuing 10,000 shares as right. So one share for every two shares is given as right. If you are a shareholder holding two shares, you get to buy one share. That one for every two is there, no? That is the right ratio. What is it? The ratio in which right shares are actually offered. Now, if you observe, Beam had previously 10,000 shares, Chutki had 7,500, Raju had 2,500, together 20. Now, when additional 10,000 shares are given, in that 5,000 rights are given to Beam. Together it will become 15, 15 by 30. He will still hold 50%. Chutki has 7,500. Chutki will have an option to buy 3,750 shares. 7,500 plus 3,750. Quickly, 11,250 divided by 30,000. 37.5 percentage of the shares are held by Chutki. That was the percentage before right issue. That will be the percentage after right. That was the percentage before right issue. That will be the percentage after right issue. You understood? Then the next point is Raju. Raju had 2,500 shares. 2,500 into 1 divided by 2. 1,250. So Raju's shares will become 3,750. With this, Raju will also hold 12.5% whatever he was holding before. So did you understand? By doing right issue, before right issue, whatever was the percentage of holding between them, 50, 37.5, 12.5, same will remain. That is the reason company will actually offer right issue to the existing shareholders of the company. And from the shareholders perspective, there are three options that we will see in CA Inter when we do investment accounting. In CA Foundation, you are seeing this entire topic from whose perspective? Company's perspective. From whose perspective? Very good. Now, I want you to know what are the effects of right issue. What are the effects of right issue? Whenever the right issue is done, company will receive money and then give shares. So the existing shareholder proportion will be same, and the company will receive money from the existing shareholders. Company will give the shares to the existing shareholders. So the percentage of holding whatever was there will remain same. Value per share whatever was there is going to decrease. Why will value per share decrease? I'll give you the reason. You are the existing shareholder. I am the company. My company's nominal value is 10. What is the nominal value of my company share? 10. In the market, the price is 125. What is the market price? 125. What is nominal value? When I offer the shares to you, if I offer at 125, will you buy the shares of the company? Why? In the market only it's 120. What if I offer it to you at 140? Will you buy it? No. Why? In the market it's at 125. Why would you buy it from me at 140? I should offer it to you at a price lesser than market price. If it's 125 in the market, I have to offer 120 or I have to offer 100 so that you feel like you will buy it from me for 100, sell it in the market at 125 and make profit. Possible, no? I'll create such kind of demand, but that will not work. Why is it that it will not work? Very simple. By the time you buy, everybody gets it, no? The supply in the market has increased. Before you can sell it, no, the demand drops and then the price gets corrected automatically. Price gets corrected automatically. I'll repeat. Nominal value per share 10. What is the market price? 125. As a company, can I offer the shares to you on right at 125 or more? No. I have to offer it at lesser than 125. Let's say I'll offer the shares at 100 rupees to you. You buy it from me for what price? 100. You can sell it in the market for what price? 125. If you buy it from me for 100, you sell it in the market at 125. Do you make profit? Yes. This profit is impossible to do. Why? Everyone in the market is smart, not just me, not just you. When the market hits with so many extra shares, no, what is happening? The supply is increasing. When the supply increases, demand drops. Am I right? And the price gets corrected in the market. The price will become automatically same. The price per share is decreasing. Value per share will decrease whenever you do right issue. You might have read two words: cumulative right price, theoretical X right price. Cumulative, theoretical. What is cumulative right price? Price per share before right issue. Price per share before. What is theoretical X right price? Price per share after right issue. Theoretical, because what is the price after right issue in the market, I don't know. I am computing what can be the price theoretically, sitting in the room holding the paper and pen and calculator. Theoretically I am computing one number. That theoretical number what I compute will be called as theoretical X right price. I hope you understood. Theoretically, if we compute a price as to what would be the price per share after right issue, it is called as theoretical X right price. I hope you all got it. Come on, let's go further. Convenience of issue. It's a very easier way of issuing the shares. If in case you have to issue shares in the open market, no, lot of work. You need to convince a new shareholder. You need to convince a new shareholder to buy. To existing shareholders, you don't have to convince. Why? They're already shareholders of the company. They know the company. They know the profitability. They know directors. They know everything. So it's easier to issue shares to existing shareholders than to issue to somebody new. And next one is image of the company will build, because people get trust on the company. Oh, in this company I had 50% stake. When the company grew, my stake in the company remained at 50%. So there was a friend long ago with whom you used to spend every minute of your life. You used to talk about every small thing that happened in your day. But over a period of time, you became so busy, your friend became so busy, now you hardly say hi to each other once a month. Get it? But if in case you share the same repo, what you used to share with that friend 5 years ago, 10 years ago, that image is different now. Like that one company, when it was small, you had 50%. Now the company grew big, you have only 5%. Then you are not liking the company. The image of the company is bad. When the company was small, you were there. When the company grew big, it hits you. You don't want it like that. So if in case you make right issue, make the existing shareholders hold the same percentage, the image of the company will get boosted. And the next one, what are the conditions for right issue? A company can go for right issue, but the notice has to be given specifying the number of shares that they're going for right issue. The time limit for executing the entire right issue is 15 to 30 days, not more than that. Minimum 15, maximum 30. The next point is you should give the option to the shareholders to renounce. What do you mean by renounce? Sell. What do you mean by renounce? Sell. When I say sell, I'm not talking about shares. Shares though you can sell. Nobody can stop you from selling shares. Here, the company is giving you an option to sell the right. What do you mean by option to sell the right? I'll repeat. I'll explain. Observe. Nominal value of my company share is 10. Market price is 125. What is market price? Can I offer the share to you at more than 125? At 125? No, it won't work. I should offer it to you at lesser price. I will offer you to buy the share at 100 rupees. How much money should you give to buy the share from me? Remember, right issue is also at premium. Right issue is not a discount. It is lesser than market price, not lesser than nominal value. What is nominal value? 10. I want you to forget nominal value completely. Market price 125. What is the right issue price? 100. Now I gave an option to you. If you want, you can give 100 rupees. You can give the voucher that I gave. You can buy the shares. I don't think I have a voucher. A small chit. Okay, fine. So let's say you are the shareholder. I'll give you one voucher. What will I give? That voucher is called as right. Discount coupon. Tara. What is it called as? What is it called? Right. What is it called? Is it share? I've given you a right. If you want the share of the company, you should give me that right. You should give me 100. I will give you share. You should give me right. You should give me 100. I'll give you share. What if you don't want? You can tear that and put it in dustbin. Okay. Now your friend who's sitting here, he wants to buy the share. He's not the shareholder of the company. Can he buy the share? If he wants to buy, where will he buy? Market. In the market, what is the price? 125. So you have to buy at 125. You have the option to buy at 100. What will you do? Instead of tearing the paper, you can sell that paper to your friend. Are you selling the share? What are you selling? Right to buy the share. You sell it to him. If you sell that right paper to him, he will give me the paper. He will give me 100 rupees. I'll give him the share. He'll give me the paper. He'll give me 100 rupees. I'll give him the share. When you give the paper to him, no, you won't give him free. You will charge some money. You will charge some. What is that money? That money is called as value of right. The process of selling is called as renouncing of right. Whenever you are the shareholder of the company, I give you right to buy the share of the company. What can you do? Three things. Number one, buy. Number two, do nothing. Number three, sell. I as a company should not restrict you to sell. I should give you an option to renounce. Renounce means what? Sell. What are you selling? Right? Are you selling share? That price at which you sell it to him is called as value of right. That is the difference between cumulative right price and theoretical X right price. I'll explain. Let's proceed. After this, unless provided by articles, this is the option that should be given. Can a company issue shares other than by way of right issue? Yes, they would have to first pass one resolution and they can give it for ESOP, they can give it against the loan, or if it is valued by the valuation officer, then it can be given to anybody at a price which is valued by the valuation officer. That's anyways not needed. You learn it in law in inter. For now, skip that part. Now, important terms in right issue. This part is important for your CA foundation. What are the important parts? Three. One, cumulative right price. What is cumulative right price? Price per share after announcing the right issue but before issue of rights. Company announced today. Let's say today is 10th of February today. I'll announce I am going to give you right shares. I am going to give you right shares. I announced it today. But right shares will be given to you on 25th of February. After I announced it on 10th of February, what is the price in the market? What is it called as? Cumulative right price. What is it called? Cumulative right price. Understood? Cumulative right value of share. The next one that I want you to find is X right value per share. What is it called? X right value of share. This X right value is also called as theoretical X right value. What is it? X right value. Cumulative right value is before right issue. Theoretical X right value is after right issue. It's after difference between this is right. This is cumulative, mean including right. This is excluding right. What is the difference between them? The value of right. If in case you are selling the right to somebody, at what rate can you sell? Are you getting it? So how do we find this theoretical X right value per share? Very easy. You should identify the right ratio. What is the ratio in which the rights are given? Let's say for every 2 shares sold by you, I am offering 1 share. For every 2 shares that you hold, I'm offering 1 share. You held 2 shares. At what rate? Market price 125. 2 shares, each share value is how much? 125. I offered you one right share. At what rate? 100. 2 into 125, 250. 1 into 100, 1 into 100. 1 into 100 is 200. 2 shares into 125. Do it in the calculator. If you tell 1 into 100, 200, then calculator is crying inside. 2 shares into 125 per share. 2 shares were there, market price 125, 250. One share you purchased at 100 rupees. X rate, right issue price. 1 into 100. 250 plus 100 divided by 3 shares. 116 point. That is the theoretical X rate price. In the market after the right issue price will be 116.67. What is the cumulative price? 125. What is the theoretical X rate price? 116. How much did it decrease by? 125 minus 116.666666. 8.33 is the value per right. 8.33 is the value per. If you sell it to them, you should sell it at 8.33. Are you getting it? Okay, observe. Theoretical X right price. How do you find? The cumulative right price multiplied by existing shares that you have plus right shares multiplied by right issue price whole divided by existing shares plus right share. I don't want you to remember it like a formula. I want you to remember it like a logic. You had 2 shares, you got 1 share as right. 2 shares were at 125, 1 share theoretical, like 1 share right issue price is 100. 2 into 125 plus 1 into 100 divided by 2 plus 1, 3. You will get 116.666. What is cumulative rate price? 125. What is theoretical X rate price? 116.666. What is right issue price? 100. What is the value of rate? 8.33. Are you getting it? Next, value of right. What is value of right? Sale price of each right if sold. If sold, that renouncing option if you take. This is cumulative right price minus theoretical X right price. What is it? Cumulative right price minus theoretical X right price. I hope you understood. Say something, make some noise. That's it. We are done with right issue. In detail, we would actually learn what are the options with the investor, but this I don't think it is needed in your marathon revision. Beta. In each of the case, what would be the situation analysis? When he buys, what would be the value? When he sells, what would be the value? All of it. But I would want you to know only this much. Okay, if you want, I can teach you this one part. This one part will do. So what is the right ratio? One for every, how many shares were there? 10,000. Nominal value 100. Cumulative right price 150. Right issue price. Okay, I'll ask some basic questions. Try and answer. I am the shareholder. I am the. I have two shares with me. How many right shares will I get to buy? Very good. Do I have to give money to company or company will give it free? I have to give money. Okay. How much money should I give to company? 125. One before the company makes the right issue. If I want to buy my share in the market, what will be the price? 150. Nominal value is how much? Fantastic. Now, can I buy the share? Can I sell the right to somebody? Very good. Can I do nothing? What is the expected price per share after right issue? Very simple. How many shares did I have with me? Two. Each share was how much in the market? 150. 2 into 150. 300. Keep it on one side of your mind. How many shares am I planning to buy? One. At what rate? 125. At what rate? 1 into 125. 125 plus 200. Sorry, 300. Divided by 3 shares. 141 point. That 141.66, whatever is there, no. That is the theoretical X-rate price. That is a theoretical. It can be found as we did 2 shares into 125, sorry, 150 plus 1 share into 125. You can do 10,000 shares into 150 plus 5,000 shares into 125 divided by 10 plus 5. Beam held 10,000 shares. 10,000 shares into 150 per share. He got 5,000 rights into 125 per share. Divided by 10 plus 5, 15,000. You still get same answer, 141.67. What is value of right? 141.67 is theoretical X right price. Cumulative right price is how much? Cumulative right price is how much? From 150 you deduct 141.67. 8.33, that is value of right. What is 8.33? Are you getting it? That's it. So we usually discuss the profit that they will make, loss that they'll make and everything. But you remember this much. 150 minus 141.67, 8.33 per share. That's right issue for you. If you know this much, then you are good enough to proceed to answer any question. All the thing that I want you to remember is accounting journal entries is separate. This what we discussed right now is computation of theoretical X-rate price and value of rate. So what about accounting? Accounting is simple. Accounting is same like how you do usually. What is the usual journal entry when you write issue of shares? Bank account debit to share capital to security premium. Same thing. Bank account debit will be right issue price. Share capital account credit will be nominal value. Security premium will be security. If you have application allotment call, write that bank to application to capital, allotment to capital, bank to allotment. Write the entries exactly like how you know. Are you getting it? Yeah. Usually when we did, we took one company which went actually for right issue recently, and then we computed that company's theoretical X-rate price before it actually made the right issue. We computed what can be the price of the company after. So if in case now I know you have exam around the corner, so don't waste your time and energy. If in case someday you are bored, search which company is going for right issue in the next 1 month. That company's market price you will know. Right ratio also you will know. You identify the theoretical X-rate price. What will be there? Write down the date on which the right issue will hit the market. On that day in the market, you see the price, it will come very close to that. If it goes up and down, it's because of other external factors. That is the reason when there is that X-rate price, I told you one very important word before that. What is it? Theoretical. Meaning what? Theoretically, by what we compute, it has to be that price. But practically, because of some government policy, because of some demand, because of some decision, because of their quarterly results, profits can move up and down, and then share price also can move up and down. But theoretically, that's so what is the price should be. Got this? Good. Right issue done. Very exciting unit which was there in CA intermediate and shifted to foundation from May 24, redemption of preference shares. Now, what do you mean by redemption of preference shares? I don't know preference share, yeah, but I'm curious about the word redemption. But anyways, we'll focus, we'll go in the same line. What do you mean by preference share? Preference share is a share which has preferential right among all the shareholders, no, who are supposed to receive dividend and are supposed to be repaid the capital. Preference shareholders are paid before the other shareholders. And all the shareholders are standing in queue collecting money. Who will get it first? Preference shareholders will get it before equity shareholders. Preference shareholders will get it before equity shareholders. So preference shareholders are the people who get the money before equity shareholders. They have preferential right. What do they have? In two situations. Situation number one, when they have to be repaid their capital. Situation number two, when they have to be paid dividend. So when we are paying dividend, do we first pay dividend to equity shareholders or preference shareholders? When we are giving dividend, do we first give it to equity shareholders or preference shareholders? When I am redeeming the capital, should I first pay preference shareholder or should I first pay equity shareholder? Are you getting it? That's the reason they're called preferential shareholders. But they are also shareholders only. What do you mean by redemption? Redemption, actually I searched, okay. It went on to tell that redemption means plural of redemptions according to Christian religion, the act of being saved from evil. Oh, दुष्कर्म से बचाव या पाप से सुरक्षा यानी मुक्ति. No, 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 it's not that, okay. Here in short, no, when we say redemption, we basically mean opposite of issue. What do you mean by redemption? Opposite of. What does the company do on issue of shares? Very simple. On issue of shares, no, company will collect cash. Company will collect cash and company will issue shares. So this is a company. Company will collect the cash, company will give shares. Company will collect the cash, company will give shares. What is this called as? Issue of. What do we mean by redemption of preference share? Opposite. Company will take the share back from the shareholder and give them the cash. In issue, what do we do? Collect the cash, give the share. On redemption, take the share back, give the money back to them. Are you getting it? Opposite of issue. Who are you in this chapter? Who are you in this chapter? Now, when you take the share back from the company, sorry, shareholder, tear it and then give them cash. Can you say the capital of the company is decreasing? Day by day, the capital of the company can increase. It cannot decrease. It cannot. When I have money, I'll give all the money to preference holders and then redeem their shares. What if later I don't have money to pay debenture holders? What if later I don't have money to pay equity shareholders? Company cannot redeem its preference shares. Company cannot reduce its capital. Other than this chapter, it's illegal. No. Company law says reduction in share capital is not allowed except by way of redemption of preference shares, by way of buyback, or through capital restructuring approved by the scheme of the court. Only in these three situations it's possible. And redemption is not simple. There are a lot of provisions of the act that should be complied. So, in the case of issue of share, the capital of the company will increase, the cash in the company will increase. In the case of redemption, the capital in the company will decrease and the cash in the company will decrease. The decrease in the capital of the company is usually not allowed. Is it usually allowed? No, not allowed. You need to comply with provisions of Companies Act. What are the provisions that you need to comply? Number one, preference shares have to be redeemable. You cannot issue irredeemable preference shares. Can you issue irredeemable preference shares which will never be redeemed? No. Every preference share that you issue is redeemable. What is the time period within which it will be redeemable? Maximum 20. Maximum? Very good. And there is additional 10 years provision allowed if the company is dealing with infrastructure development. Okay. Whenever preference shares are redeemed, it can be either redeemed out of divisible profits or out of fresh issue. It can either be redeemed out of divisible profits or out of. What do you mean by divisible profits? I have made business. With business, I want profit. I have good profits. I have good money. With that money, can I redeem preference shares? Yes. Or I don't have money, but 20 years is over. I have to redeem preference shares. How do I redeem? I'll find some fresh equity shareholders. I'll give equity shares to them. I'll collect cash from them. I'll use the cash collected from equity shareholders to redeem preference shares. Can I do it? So, what are the sources of money for the purpose of redemption? Two. Number one, divisible profits. Number two, fresh issue of equity shares. Are you getting it? What I would want you to know additionally is, in order to redeem preference shares, shares should be fully paid up. Can you redeem a partly paid up share? Why is it that we don't redeem a partly paid up share? If you make the call, you might just do forfeiture. If you can do forfeiture, you should not go for redemption. For example, I am a shareholder in your company. There is a 10 rupees share. I have paid 6 rupees. How much have I paid? Now I have paid 6. 4 rupees you have not called, I have not paid. Can you redeem the preference share and give me 4 rupees? No. To redeem the preference share and then pay me 6 rupees, I would have to be fully paid up share. Basically, you should make the call for 4 rupees. I should give you 4 rupees. Share will become fully paid up. Then you will refund entire 10 rupees to me by redemption. The reason why you cannot redeem the partly paid up share is the share is 6. If you ask for 4 rupees, what if I don't pay 4? You can forfeit the share. You need not even give me 6 rupees. And there is a forfeiture option. Why would a company go for what to say redemption? So in order to redeem the share should be, if it is a 10 rupees share, it should be paid up 10. If it is paid up 6, is the redemption possible? Are you getting it? Say something. Very good. The next point that I want you to notice, premium can be paid on redemption. A 10 rupees share when you're redeeming, can you pay 11? Yes. Can you pay 12? Yes. Can you pay 15? Yes. But that premium, whatever you pay, it can be paid out of profits only. If you have made profit, you can give premium. If you have not made profit, you can't give premium. You want to redeem 10 rupees preference share at 12 rupees. Can you pay 12? Yes. If you have 2 rupees profit. What if you don't have profit? You can't. What if you don't have profit but you have cash? You can't. That premium or redemption of preferences, whatever comes, no, that premium is deducted from P&L balance. Premium on redemption of preference shares is deducted from which balance? P&L balance. Can you reduce it from security premium? No, not allowed. No, not allowed. Very important point. Okay. When you redeem preference shares, the capital of the company will reduce. When you redeem preference shares, the capital of the company will, that is not allowed. The capital of the company should not reduce. The extent to which capital reduces, you create CRR. Let's say 10,000 is your preference share capital. You redeem it preference share capital 10,000. How much did your capital decrease by? Capital is reducing by 10. You don't want that to happen. In your P&L or in your general reserve, you have some money, no? 10,000 will be shifted to CRR, capital redemption reserve, which will be later used to make bonus issue so that the capital will come back to same level. So can the capital of the company reduce? Can the company redeem preference shares? But whenever they redeem preference shares, they have to create capital redemption reserve. To the extent nominal value is redeemed out of external funds. I'll explain this part to you slightly in detail. I want to redeem 10,000 worth of preference shares. How much preference shares am I redeeming? 10,000. I don't want to what do you say, use my profit, or I don't want to use my cash. I'll freshly issue equity shares to somebody to the extent of 10,000. I collected that cash 10,000. I gave it to people and then redeemed preference shares. Can I do this? Yes. Now, how much is my preference share capital decreasing? 10,000. How much is my equity share capital increasing? Should I create CRR? However, if I'm redeeming preference shares worth 10,000, if I'm redeeming preference shares worth, I am issuing equity shares worth 8,000. Where did balance money come? I have in my pocket. I have in my pocket 8,000. I freshly issue equity shares. I received cash. 2,000 is there in my pocket. Together 10,000 I will pay to you on redemption. How much is my preferential capital reducing? 10. How much is my equity share capital increasing? Can I do this? Yes. Should I create CRR? Yes. How much? Why? Preference share capital decrease 10, equity share capital increase 8, net decrease 2,000. Are you getting it? That's with this provision. We'll discuss that in detail. The next point that I want you to know is sources of funds for the purpose of redemption. Where can the money come from? I told you, two sources, internal, external. What is internal? Internal means everything other than fresh issue of shares. What is internal? Everything other than fresh issue of shares. If you use the cash and bank balance, if in case you sell the assets, or if in case you issue debentures, or if you sell investment, all of that is internal funds. External funds is only one. What is external funds? Issue of shares. Other than issue of shares, even if you issue debentures, what is it? Internal funds. When you use internal funds, you have to create CRR. When you use external funds, you don't have to create CRR. Why? I am redeeming 10,000 worth preference shares. I am issuing 10,000 worth equity shares. Did the capital decrease? So I don't have to create CRR. When I redeem 10,000 worth preference shares, I did not issue equity shares. I sold my car or I sold my investments. Capital is decreasing. So I have to create CRR. What is CRR? Capital redemption reserve created on redemption of capital. Reserve created on redemption of capital to ensure that the capital doesn't decrease. To ensure that the capital doesn't decrease. What do we create? CRR. Everyone got this? Okay. CRR. What is it? Created to the extent of nominal values redeemed out of internal funds. If you use external funds, no need to create CRR. Only if you use internal funds, sale of assets, investment, divisible profit, CRR. I'll make you do some small questions to understand this. It is created out of free reserves, general reserve and P&L account. Then CRR can be used only to issue fully paid up shares as bonus. Can you use CRR for any other purpose? Not at all. Done. Say something. Next, we have one beautiful concept: how to compute number of shares to be issued. Lot of times in the question, they will tell issue 3,000 equity shares of rupees 10 each in order to redeem preference shares worth 1 lakh. That is easy. Sometimes they will not tell how many shares to issue. They will tell you tell me how many shares should I issue. Company wants to issue minimum possible number of equity shares. Have you come across that? How to compute it is there like this, but you would not understand this if I explain it this way. You would not understand. So what do? We'll do some cute questions. Are you ready? We're going to spend little time on this because this deserves that extra time and effort. Focus. We are going to do redemption of preference. की पेटी बांध लो मौसम बिगड़ने वाला है तमिल कन्नड़ मराठी हिंदी focus. Redemption of preference shares is opposite of issue of preference shares. In issue, cash and capital will increase. In redemption, cash and capital will decrease. Can you do redemption at par? Yes. Can you do redemption at premium? Can you do redemption at discount? No. Redemption cannot happen at discount. Redemption can happen at par or premium. Whenever you do redemption at premium, where do we adjust that premium? It has to be adjusted against profit and loss. What if there is no balance in profit and loss? I am sorry. Redemption at premium not possible if you don't have balance in P&L. The next point that I want you all to note: share capital of the company cannot decrease. Can it decrease? If it decreases, you have to compensate it by way of CRR. CRR means capital redemption reserve. Everybody got this? Very good. It is created out of general reserve and P&L. It will be later used for bonus issue. So this is the balance sheet of a company. Look at balance sheet liability side. What do we have? Preference share capital 10,000 shares of rupees 10 each. General reserve is 10,000. Together. That it's not tallying. It's extra. It is very good. Now, how much should I pay on redemption of preferences? Redemption is at par. Redemption is at. Am I paying premium? No. I'm redeeming preference shares at par. If I'm redeeming them at par, how much should I pay? 1 lakh. How much should I pay? 1 lakh. How much cash do I have? How much cash do I have? Okay, can you see the question? I want you to see and then answer. How much is the preference shares in the balance sheet? How much is the cash available? 1 lakh. I want you to think and answer. Can I, as a company, redeem the preference shares without making fresh issue? Should I make fresh issue of shares? Should I make fresh issue of shares? Can I redeem preference shares without fresh issue? How can you say that I can do it? I have cash of 1 lakh 50. That's where you are absolutely wrong. You're only seeing one aspect. That is the reason you find redemption of preference shares wrong. See the whole picture. Okay, I'll use this cash of 1 lakh 50. I'll pay 1 lakh. Preference share capital will become 0. Cash will become 50. The problem is capital of the company cannot decrease. If the capital of the company decreases, what should we do? CRR. CRR is to be created. How much did capital decrease by? 1 lakh. How much CRR should I create? I have how much free reserves? How much CRR can I create? So can I redeem preference shares of 1 lakh using the cash of 1 lakh 50? Yes. but I don't have enough funds to create CRR. So in this case, is company capable to do redemption of preference shares without fresh issue? Answer is no. Is the company capable of making redemption of preference shares without fresh issue? No. It has to go for fresh issue. It has to go for very good. Read the answer here. Can we redeem preference shares without fresh issue of shares? Read. If preference shares are redeemed using cash available, that is without fresh issue, then we have to create CRR for 1 lakh. Am I right? Okay. Reserves are not available to create CRR for reserves are not available to create so much CRR. Is it available? It is not available. Here the brightness was less. So reserve is insufficient, so we cannot create CRR, so we have to go for fresh issue. To what extent should the shares be issued? How much CRR can I create? 10. So how much can be out of the internal funds? 10. How much should be out of external funds? 90,000. So 90,000 worth of shares have to be issued. 90,000 worth of shares have to be. Okay, now answer my next question. 90,000 worth of shares have to be issued. If the issue price is 12, nominal value is 10, how many shares are supposed to be issued? 1 lakh is the amount payable. 10,000 is the reserve available. What is the shortage in reserves? 90. 90,000 should be divided by nominal value of 10. Should be divided by nominal value of 10. How much does it come to? 9,000. So we should issue 9,000 shares. How many shares should I issue? Of rupees 10 at rupees 12, so that I get enough money. 9,000 into 12. How much cash do I receive? 1 lakh. There is no problem with cash. The problem is not cash. How much will the capital increase when I issue 9,000 shares? 9,000 into 10. Nominal value or no? Capital will increase. How much will capital increase by? 90. How much is preference shares redemption? 1 lakh. Preference shares are going down by 1, and equity shares are increasing by 90. Difference of 10,000. I have general reserve using which I can create CRR. Do you get the logic? When I freshly issue 9,000 equity shares, I'll get 90,000 worth of paid up capital. Capital is increasing by 90. Preference shares are reducing by 1 lakh. 10,000 I can create CRR using general. Understood? So 90,000 shortage was divided by 10. How many of you think, sir, shouldn't 90,000 be divided by 12? Let's check. Do 90,000 divided by 12. 90,000 divided by 12. 1 lakh. 90,000 divided by 12. 7,500 shares are issued. Am I right? If you issue 7,500 shares, how much will nominal value of capital increase by? 7,500 into 10. 75,000 equity share capital increase. Preference share capital reduced by how much? 1 lakh. Preference share capital is reducing by 1 lakh. Equity share capital is increasing by 75. Difference 25,000. There is decrease in capital. Correct? No. Preference share capital is reducing by 1 lakh. Equity share capital is increasing by 75. Can I say 25,000 decrease in capital? You have to create CRR for how much? 25. How much reserve is available? Agala. So that is the reason whenever shortage was there, did we divide by nominal value or did we divide by issue price? Nominal value. Are you getting it? The problem is not cash. The problem is reserve availability to create CRR. But your strong instinct of learning should tell you, sir, I remember dividing by issue price. Do you remember? Did you learn it wrong? No, you learned it right. But do you also remember sometimes dividing by issue price? Yes. So, majorly, the only point of issue, what every student finds it difficult in redemption of preference shares is, if you observe working notes, in some questions you divide by nominal value, in some questions you divide by issue price. You don't know when to do what. That is the problem. Now I have explained the problem. Can I now further take you into the solution now? Yeah. How many of you already had this doubt? Rest of you, if you study, you will have this doubt. Now you understood the doubt? Okay, now look at this. This is AQ2. How much cash is available? This is the second question that we're doing. Okay, how much cash is available? Okay, now aram se. We're redeeming preferences at par or at premium. I have not got you to premium at all. I have not got you to premium at all. Aram se will finish par. No worry, I have time. Take 1 lakh rupees preferentials to be paid. How much cash is available? Not sufficient. How much is shortage? How much is shortage? Can I redeem preferentials using internal funds without fresh issue? I'll repeat. Can I redeem preferentials using internal funds without fresh issue? Say, there are only two answers. Yes or yes. What? Tell yes or no. Yes. No. How many of you say yes? Cash illegal. Okay. Okay. Tell me what is the journal entry when you give reserve to your shareholder? Share ಕೊಡ್ತೀರಾ reserve ಕೊಡ್ತೀರಾ? You give cash. You give. You cannot give reserve to the shareholder. How can you give reserve? Reserve account debit to share. What yeah? You give cash. You give. You should remember double entry system. You are saying double entry. Throughout you people are learning single entry only in mind. Reserve is credit aspect. We should give cash. No. How much cash is available? In your balance sheet there is profit, but in your cash there is no. In your box there is no cash. Is that possible? Yeah. Rich does not mean cash. Profitable does not mean cash. You bought this for 100 rupees. You sold it to me for 1000. How much profit? You 900 cash ಇಲ್ಲ ಅಂತ ಯಾಕೆ I have purchased. I am your debtor. I am not giving you cash. Do you make profit when I give cash or do you make profit when you sell? Sold. You bought this for what price? 100. You sold it for what price? How much profit did you make? But can you have zero cash? Yes. Cash does not mean profit. Somebody has full cash but no profit. Possible? Yes. They might have taken loan. Cash doesn't mean profit. Profit doesn't mean cash. Profit is credit aspect. Cash is debit aspect. They're different. You need to disassemble that. Disconnect those 2 points. Only then you will understand accounts correctly. If you keep them connected, then gone. You understand? How much should you pay to preferential holders on redemption? How much should you pay preferential holders on redemption? How much is available in cash? Can you redeem preference shares without making fresh issue? Answer is free. Can we redeem preference shares without making fresh issue? To redeem preference shares, we need cash of 1 lakh. However, cash available is only, so company has to issue equity shares to raise cash. Alternatively, they can sell assets or investments. Irrespective of the fact, there is sufficient reserve for creation. How much reserve is available? So if I redeem, I can create 1 lakh CRR. CRR is created after redemption. To redeem, I need to give cash. You're telling, if in case I kill, I have a place to dig and then bury. But to bury, you should kill. To kill, you should have a knife. Do you have a knife? No. Oh. You have a pit to bury the body, but you should have a knife to kill. After killing only you bury, no? You're getting it? So you need to have cash. You don't have cash. Should you make fresh issue here? Yes. Now, same story. Nominal value 10. Issue price 12. What is nominal value? 10. Issue price? You tell me how many shares should I issue? Nominal value 10. Equity shares to be issued, nominal value 10. Issue price is 12. I want to redeem 1 lakh rupees worth of preference shares. I have cash of 10,000. I have reserve of 1 lakh 50. How many shares should I issue? How did you arrive at the answer? You took 1 lakh minus what? 10,000. How much is shortage? 90,000 was divided by nominal value of 10 or issue price of 12. Issue price of 12. Then you will get 7,500 shares. Sir, here you told divided by 10. Alli bere, in bere. Why? Here, where is the shortage? In this case, shortage is in cash. Shortage is in the previous question. Shortage was in reserve. Cash ನಮ್ಮ ಹತ್ರನೇ ಬೆಜ್ಜಾನಿತ್ತು. Problem was not cash. Here, what is the problem? Problem is with cash. This question, problem is with 1 lakh rupees is payable. 10,000 cash available. Shortage in cash 90. Divided by 12 rupees issue price. What do we get? 7,500 equity shares are to be issued. If you issue 7,500 shares at 12 rupees, how much cash will you get? 7,500 into 12, 90,000 cash you got on fresh issue. How much cash do you already have? Together, how much do you have? Can you pay 1 lakh to the preference shareholder? Yes, 1 lakh, take it. Tata, bye bye. How much did the equity shares did I issue? How much equity shares did I issue? 7,500. How much did equity share capital increase by? 75,000. How much did equity share capital increase by? 2 rupees premium, 15,000 security premium. How much did equity share capital increase by? 75,000. How much is preference share capital decrease by? 1 lakh. How much is net decrease in the capital? 25,000. I have reserves to create CRR. The problem is not with reserves. Now you understood? First question, where was the shortage? Reserve. What did we divide by? First time, what was the shortage? Reserve or cash? Reserve. Shortage was divided by? Understood. Second case, what is the shortage? It was divided by. So in short, always check the question. Where is the shortage? If the shortage is in now, if the shortage is in reserve, divided by nominal value. If the shortage is in cash, divided by issue price. You understood some logic? Now come here. Now see this. Number of shares to be issued. If they only tell how many shares to issue, very good. If they don't mention number of shares to be issued, what to do? Check. Is there sufficient profit to create CRR? Or is there sufficient cash to pay? If the problem is with CRR, money to create CRR, what to do? Nominal value of preference shares to be redeemed, deducted by available divisible profit. Available divisible profit means profit available cash Allah. Profit available to create CRR. Cash is on the asset side, profit is on the liability side. You guys are throughout telling cash, cash, cash. Itkole cash ನೀವೆ. Example cash ಕೊಟ್ರೆ pass ಮಾಡ್ತಾರಾ? No. Nominal value of answer yeah, nominal. Open your mouth and read. That's how it works. 10 years of school. In college, when I won't talk. Teacher tell, I will write exam. That's why you lose less marks. School, teacher used to tell, you used to repeat repeatedly. College, what happened? Two horns here, one tail here. Cut my money, please. In the class, please be responsive. That's when you understand. Just by seeing, you will not understand. When you go to a cricket match, will you just see and come? He will hit the six. You will shout. You go to concert. Singer is singing. Will you sit like this and then listen? You pay 10,000 rupees to buy the ticket. That singer is singing with your bad voice. You will also start singing. Why? That's when you get involved. Are you getting it? Why do you don't do that in class? Get involved. Please read. Nominal value of preference shares to be redeemed minus what? Available divisible profit. Why? To the extent you can actually create CRR, you will deduct. If you deduct whatever you get, no, that is shortage. Shortage in cash or shortage in reserve? Reserve. Shortage in reserve will be divided by what? Paid up value or nominal value? Paid up value or? However, next case, shortage is in cash. Redemption value, you will not take nominal value of preference shares. You will take with the premium value. If preference shares have to be redeemed at premium, you take with the premium value. From that, you deduct the cash that you have available. Minus 100, what do we get? Shortage in cash. Shortage in cash should be divided by what? Issue price per share. Are you getting it? Yeah. Would you want to make a note of this? Yeah. Copy. Come on. Let's take the next question. Now, I hope you understood. Quick revision. In revision also, we'll do revision. Listen, listen, listen. When the shortage is in reserve, you divide by nominal value. When the shortage is in cash, you divide by Pakka. When you issue shares, you receive cash. So cash shortage issue price. When the shortage is in reserve, reserve stays in the liability side where share capital stays with nominal value. So shortage in reserve, nominal value. Shortage in cash, issue price. Are you getting it? Very nice. Come on. Next up, let's do a quick check of the next AQ. Have a look at this. I'm going to make things little complicated now. Situation is going to become slightly more serious. See, how much is preferential capital? 1 lakh. How much is preferential capital? You are going to redeem at premium. You're going to redeem at How much premium should you pay? 20%. Do 1 lakh plus 20%. 1,20,000. How much cash should you give? How much cash should you give? 1,20,000 should be given on redemption. How much cash is available? Is there shortage in cash? I have 30,000 extra. We can all go to Goa trip and come. So there is after CA foundation exam. Am I right? So do we have enough cash to redeem preference shares and go to Goa trip? Yes. So there is no problem with cash. But when I redeem 1 lakh worth of preference shares at premium of 20%, do I have to create CRR? Yes. Why the capital is decreasing? How much CRR should I create? How much CRR should I create? To the extent capital is decreasing. If I teach you something new, something old, you will forget. How much CRR should I create? To the extent capital is decreasing. How much is capital decreasing? Don't 1 lakh 20, 1 lakh. 1 lakh. Am I right? 1 lakh. 1 lakh I should create CRR. How much is available? I don't have enough to create CRR. I don't have enough to create. So what should I do? I have to make precision. I have to make. Okay. Further, how much is the shortage in reserve? How much is shortage in reserve? Who told 90? Correct answer. Not 70. Sir, how? When you pay 20% premium, where will premium be paid out of? Profit and loss, no. 30,000 profit is there. In the 20,000 P&L will go towards premium. How much is available? 10. How much is capital decreasing? 1 lakh. I should create CRR for how much? 1 lakh. How much is available? 10. How much is shortage? 90,000. How much is shortage? If I have to issue fresh equity shares of rupees 10 at rupees 12, of rupees 10 at rupees 12, you think and tell me how many shares should I issue? 90,000 divided by 10 or 12? Ask, shortage is in reserve or shortage is in cash? Reserve is on liability side. Along with reserve comes capital. Capital is at nominal value divided by nominal value of 10. 90,000 divided by 10. 9,000 shares have to be issued. If they only give easy, if they ask us to find all of this, okay. And then you will say, I've written the answer, ICAI did not give marks, paper is difficult, ICAI is bad, they are complicating foundation exam, nothing, it's there in syllabus. We read mail and go. So only mail people will pass. Entire cake will be damar, only cream will pass. Fine. If we issue 9,000 shares of 10 each, 90,000 rupees equity share capital is increasing. 9,000 shares if you show, how much is equity share capital increasing? 90,000. How much is preference share capital decreasing? How much is net decrease in capital? 10,000. How much P&L do I have to create CRR? How much P&L do I have to create CRR? 30. I've highlighted it. You just have to tell what I highlighted. How much P&L account balance is there to create CRR? 30. In the 20,000, that premium or redemption will be adjusted. 10,000 I'll use and create CRR. Are you getting it? Say something. If I would have divided by 12, it would have been not sufficient. Okay. Next case. Are you ready? Okay. Come on. Let's go to the next one. Have a look at this. What is nominal value of preference shares? 1 lakh. Let's say I'm supposed to redeem at premium of 20%. How much is the money that I should pay? 1 lakh. Pakka 1 lakh 20. How much cash do I have? Do I have sufficient cash? How much is shortage in cash? How much is shortage in cash? 1 lakh. 1,20,000 minus 10,000. Shortage is 1 lakh. Okay. Can I redeem preference shares without making fresh issue? Can I redeem preference shares without making fresh issue? I have to make. I have to make what? Maggie or what? I have to make fresh issue. Let's say equity shares to be freshly issued, nominal value 10, issue price 12. How much is shortage here? 1 lakh 10. Will you divide it by 10 or 12? 12. Why? Shortage is in cash. Cash will come by issue of shares. You should divide it by issue price. Are you getting it? What will happen if you divide it by 10? Let's say 1 lakh 10,000 you divide by 10. Divided by 10. How many shares should you issue? 11,000 shares you should issue. Am I right? 11,000 shares into 10. 1 lakh, 1 lakh 10,000 is the increase in share capital. Preference share capital is decreasing by how much? 1 lakh. Net capital is increasing by 10. There is no need. There's no need. Are you getting it? Say something. Come on. Let's go. Or even if you do 1 lakh 10,000 cash you got, 10,000 cash you already have, 1 lakh 20. That you might using for paying 1 lakh plus 20, 1 lakh 20. Cash is sufficient, but capital condition is never. So what should you do? Should always keep in mind, if the shortage is in reserve, divide it by nominal value. If the shortage is in cash, divide it by. For reserve shortage, what should you do? You should take nominal value divided by reserve available after deducting premium on redemption. For cash, redemption price. See, what did you write to check availability of cash? Redemption price minus cash available. How do you check cash available? See, what did you do? Redemption price minus cash available. What did you do for nominal value shortage? You did nominal value minus reserve available. You getting the difference? Everybody, fantastic. One last one marks. I think we have everything covered, sorted. Not an issue. That's one thing that I wanted you to be cautious about. Rest everything you will handle. Not a difficult part. Then the journal entries are very simple. At first, when you have to redeem the preference shares, first debit preference share capital, and then also debit premium on redemption if there is any. Credit preference share holder. Then preference share holder to bank. Preference shareholder to bank. Then finally that premium or redemption should be transferred to P&L, and you have to create CRR using divisible profit. Divisible profit is general reserve and P&L account. What is divisible profit? General reserve and P&L account. You will debit general reserve, you will debit P&L account, credit CRR. If in case some shares are issued, bank to equity shares. I hope you understood. Same class of shares cannot be issued to redeem same class of preference shares. To redeem preference shares, can I issue preference shares exactly same percentage and then redeem? No, no. To redeem preference shares, I'll issue equity shares. That you learn in detail in law when you come to inter. But I think rest of it you people are clear. Same set of journal entries. I hope you people have understood redemption of preference shares by this. Is that okay? Fantastic. Can we now go to redemption of debentures? Let's start with the last unit, which is there in the topic of company accounts, redemption of debentures. Earlier, you had done issue of debentures. Now we are going to redeem the debentures what were issued. What is debenture? It's an acknowledgement of debt. How can the debenture be issued at par, premium, discount? On redemption also, debenture can be redeemed at par. Debenture can be redeemed at premium. Debenture can be redeemed at discount. You have lot of information jumbled and then given in your book. Listed entity, non-listed entity, that, this or not required. Only thing that you would have to know is whenever there is an entity which has issued debentures, it has to maintain DRR at 15%. It has to, sorry, 10%. It has to maintain debenture redemption reserve at 10%. Now, the problem comes in understanding the DRR because you only remember 10%, you only remember the journal entry, it's irritating. You need to know why 10% and what is the logic behind the DRR concept altogether. 10% is number given in law. What is the logic behind DRR of 10%? Let's say I have issued debentures today. When should I do redemption? Minimum after 5 years. 10 years and all is allowed. Let's say 5 years is the period. I've issued debentures in 2025. I will do redemption in 2030. When did I issue debentures? 2025. When am I redeeming? 2030. 1 lakh is the nominal value of debentures issued. How much is the debentures issued? On 1 lakh debentures issued, I've collected 1 lakh cash. As a company, I've done business. Using the money, I've made a profit. I made 15,000 profit. How much profit did I make? What will I do with profit? I'll give interest to debenture holders. After I give interest, balance is profit. I'll give preference dividend. I'll give equity dividend. I'll transfer it to free reserves. I will give higher dividend to equity shareholders. I can do all these things. No, say something. How much profit did I earn? 15,000. How much debenture interest did I give? 10,000. 15,000 only, 10,000 gone. How much is remaining? 5. Let's say I gave 3,000 preference dividend, 2,000 equity dividend. Done. Next year again, how much profit did I earn? 15,000. 10,000 debenture interest. 3,000 preference dividend, 2,000 equity dividend. Gone. 5 years are also done like this. Fifth year end. My debenture holder no longer wants interest. What does he want? He wants debenture money. He wants, I'm like, I have 15,000. If you want, I can give interest. If you want, I can give. I have money enough to pay interest. I don't have money enough to redeem debentures. As a debenture holder, you will look forward for interest annually, but you would want redemption of debentures at the end. You want full nominal value plus premium. As a company, if I take debentures today, if I issue debentures and take money today, I should not plan just to pay interest on debentures. I should plan to redeem debentures. 1 lakh rupees I've taken today. I've started doing business. After 5 years, I need to pay 1 lakh. No. To pay 1 lakh, I should save from today. I cannot suddenly, after 5 years, think of making 1 lakh. I'll make one new loan of 1 lakh, pay the old loan of 1 lakh. What did you do last 5 years? So, in the event of profit, what if the company uses the entire profit to pay dividends, to pay equity shareholders, and forget to save money to redeem debentures? So, company law will tell you have to save 10% of nominal value of debentures in DRR. Need to save 10% of nominal value of debentures in which account? DRR. First year, you made 1 lakh debenture money you collected, 15,000 profit you made. Am I right? In 15,000, when you give 10,000 interest, 5,000 is remaining. You should know it's not sufficient. You know why? The moment you issue debentures and you collect 1 lakh rupees, no, you need to invest 10% of 1 lakh. How much is 10% of 1 lakh? 10,000. Where? In DRR, debenture redemption reserve. From your general reserve or P&L, you have to deduct 10,000. Keep it in one reserve called DRR. When you log the reserve, no. When you log the reserve, no. You cannot use it for any other purpose. I'll give you an example. I want to give dividend. I want to give dividend in my company. From where will I give dividend? Profit. Free reserves. Dividend is given in cash, but it is given out of reserves. Dividend is given in cash, but it is given out of. Imagine my balance sheet. Liability side, I have general reserve 10,000. I have general reserve. I have cash 1 lakh. General reserve 10,000. Cash 1 lakh. How much dividend can I give? Can I give 1 lakh dividend? I can only give 10,000. Cash is given as dividend, but cash is given out of profit reserve. I'll repeat. Balance sheet, asset side, cash is how much? Sorry, balance sheet, asset side, cash is how much? 1 lakh. Profit is how much? 10,000. How much dividend can I give? I have cash of 1 lakh, but that's not profit. You will give it out of profit only. Are you getting it? So, alternate scenario. Company's balance sheet, liability side, reserves is 1 lakh. How much is profit? 1 lakh. How much is profit? How much is cash? 10,000. How much dividend can they give? 10,000. Why? The reserve is available. You should give cash, no? How can you give reserve as dividend? Are you getting it? So, if profit is there 1 lakh, cash is there 1 lakh, how much dividend can they give? 1 lakh. Reserve is how much? Cash is how much? How much dividend can they give? But you don't want them to give 1 lakh. Why? If all the money that you earn, if you give it as dividend, how will I get my redemption of debentures? So what they tell is, out of this 1 lakh profit, you keep 10,000 as DRR. Debenture redemption reserve. You will take it from general reserve, you take it from P&L, keep it in DRR. Money which is there in DRR cannot be used for bonus issue. Money which is there in DRR cannot be used for redeeming preference shares at premium. It cannot be used to given as dividend. Nothing. You cannot use it for any purpose. It has to be used only for redemption of debentures. So from reserves, we keep 10% in DRR. From cash, we keep 15% in investment. From the reserve, how much do we keep? 10%. From cash, how much do we keep? 15%. 15% will be kept in DRR investment. It's called DRR. So DRR investment means what? You search, will you find some investment, DRR investment? No. DRR investment is a name that we give. You can invest it in mutual funds. You can invest it in gold. You can invest it in exchange traded funds. You can invest it in mid cap, large cap, fixed deposit, government bond, treasury bonds, anywhere. That investment is made to ensure that you will have enough money to redeem debentures at the end. So it's called as DRRI. For example, when you were born, your father kept some money in some investment. Why? One fine day, when my son becomes 18-year-old, if he wants to go to US and then do MS, I need money. To do that, he did not save the money when you became an engineer. He saved the money when you went to LKG only. Are you getting it? That is called children education investment. Children education for the education of children. That there is no investment called children education investment. You might have invested in silver. You might have invested in mutual fund. You might have invested in Infosys share, or you might have invested in gold. Might have got government bonds. But that investment name in our books of accounts is children education investment, children marriage investment, retirement investment, new house investment, world tour investment. Investment's purpose is debenture redemption reserve, not the name of the investment. Inside investment can be some risk-free security. Risk-free means what? Not too risky. Up and down, no. I want almost like standard growth, not too steep down. Are you getting it? So, from the reserve, how much should we take and then keep in DRR? 10%. From the cash, how much should we take and keep? This is minimum limits. This is companies in practicality maintain much more than 10% and much more than 15%. They should maintain minimum 10 and minimum 15. This 10 and 15 is not in the year of redemption. It should be maintained at the beginning only at the time of issue. If they maintain it on the date of redemption, on the time of issue, that should be minimum percentage. But in the questions that they give us, no, they would have not maintained it in the year of redemption. So we create DRR, we create DRRI, we redeem debentures, we reverse DRR, we reverse DRRI. This is doing it for the sake of doing. Katacharat ಮಾಡಿದ್ದಾರೆ. This is doing it for the sake of doing. But in reality, they will maintain DRR and they'll maintain DRRI from much earlier. Are you getting it? So, debenture redemption reserve should be maintained at 10%. Debenture redemption reserve investment should be maintained at 15%. Of what? Nominal value of debentures. Of what? Nominal value of 10% of reserve Allah, 10% of nominal value. 15% of cash available Allah, 15% of nominal value of debentures. Did you understand? What is the entry when you create DRR? One reserve is decreasing, another reserve is increasing. Decreasing reserve debit, increasing reserve credit. Help me, what is the journal entry to create DRR? Free reserve account debit to DRR. Free reserve account debit to. What is the entry to buy DRR investment? DRR investment account debit to. DRR investment account debit to. Very good. What is the entry on the redemption date for sale of DRR investments? First, you should sell investment. From the money that you get, you will pay debenture. Bank account debit because you are selling. Money is coming in. DRR investment account credit. Why? Money is going out. Why do we debit bank account? For money that's coming in. Why do we credit DRR investment? Is for the money going out. If in case there is profit, credit P&L. If in case there is loss, debit P&L. If there is profit, credit P&L. If there is loss, Akka. So what is the entry on sale of DRR investments? Bank account debit to DRR investments. If there is profit, credit P&L. If there is loss, debit P&L. Akka. Say something. Then we have to pay debenture holders. How to pay debenture holders? Very simple. Debenture is decreasing, debit debenture. Credit debenture holder. If in case we have promised them premium, debit premium. PORD. If you remember on issue of debentures, we had credited some provision called premium on redemption, expense booked today to be paid later. That provision what you had created on issue we are debiting now, it will get nullified. This would have been already charged to P&L. We don't have to charge it now. And whatever debenture holder that you've written here, you will close it by writing debenture holder to cash. Now debentures are closed. What will you do with DRR that you had created? No longer needed. So this DRR, whatever you had created, no, you will reverse. What will be entry? DRR account debit to general reserve. DRR account debit to. I hope you understood the entries. This is a very, very important point that I want you to know. These are the steps that you should follow when you're solving DRR based question. and debenture redemption. If you can get this right, you can not go wrong. I in fact want you to copy this down if you have not. And after this, I'll explain it once. Okay, chalo, copy. This is what I want you to note. Whenever you get question on redemption of preference shares, first and foremost thing, compute the nominal value of debentures. Number of debentures multiplied by price per debenture, you multiply, you will get total nominal value for debentures. Multiply that with 10%. Whatever you get the value, check in the balance sheet on the reserves and surplus, is there so much DRR? If it is there, very good. If it is not there, then write the entry general reserve or P&L account debit to DRR. If it is there, but it is not sufficient, then what to do? Again, you need to create that insufficient portion. How much ever is not there, right? General reserve debit, P&L account debit to DRR. The first point, whenever you see the question, compute nominal value of debentures, check 10%. If DRR is there, good. If it is not there, create DRR. Second thing, once you create DRR, you need to check if there is DRR investment. How do you check DRR investment? Very simple. On the same nominal value of debentures, compute 15%. 15% of the debenture value should be there on the asset side in the balance sheet as DRR investment. Is it there? Yes, good, no problem. What if it's not there? Purchase DRR investments. What is the entry? DRR investment account debit to bank for purchase. These two entries should be done before you start with redemption. These two entries should be done before you start with redemption. Even if the question is on redemption of debentures, once you do this only redemption will start. On redemption, you need to do 3, 4, 5, 6. 3. First, you will sell DRR investments. First, you will sell DRR investments and collect cash. What is the entry when you sell DRR investments? Bank account debit to DRR investment. If they give the selling price, write the selling price and then find profit or loss. Profit credit P&L, loss debit P&L. If debenture redemption reserve investment is sold at profit, entry will be bank account debit to DRR investments to P&L. If it is sold at loss, bank account debit, P&L account debit to DRR investments. If they don't mention selling price, assume it is sold at cost, no profit. Assume it is sold at cost, no profit, no loss. Straight away read the journal entry, bank account debit to DRR investments, period, full stop, done. What's after this? After sale of DRR investments, pay debenture holders. How to pay? First, create the liability. Close debenture account, credit it to debenture holder. Debenture account debit to debenture holder account. Debenture account debit to, if in case there is premium on redemption, right? Debenture account debit, premium on redemption of debenture account debit to debenture holder. By that, we're done with this sixth one. But before you redeem debentures, any interest outstanding till the date of redemption needs to be paid. Any interest outstanding on the debentures till the date of redemption should be paid. After that, finally, that premium on redemption, if provision is already created on issue, at the time of issue, if you already written bank account debit to debenture to premium on redemption of debentures by debiting loss on issue, Lloyd, Point, there you already credited premium, provision created, credited. Now when you pay premium, it will get debited, it will get closed. If premium provision was not created on issue, now you create it, means say now you write it off to P&L account. Write P&L account debit to premium. Final settlement entry, pay debenture holder by writing debenture holder to cash. Finally, the DRR is no longer required. Write DRR account debit to general reserve. The 10% minimum whatever was created can be transferred back. Remember, 10% and 15% limits whatever you came across are only minimum limits. They are not the maximum limits. Are they minimum limits or maximum limits? Minimum, not the maximum. I hope you got it. By this we finished the last chapter, last unit of redemption of debentures. We have uploaded couple of other videos on two varieties of questions that will come on this redemption of debentures. One variety where you have to create DRR investments, redeem debentures and then close. Second one, conversion of debentures to equity shares. Both of them are there in the same YouTube channel. If in case people who are watching it can't find, please do mention in the comments. We'll share the link so that you get to access that also. If you can do those two varieties of questions on redemption of debentures, will be sorted with this part.
Are May 2024. No, the exam which actually happened in the month of June 2024 of CA Foundation Accounting. This is the first time after the change in the scheme of education and training. So let's begin. Question number 1 is compulsory. We know it. Out of the rest 5 questions you need to answer for. That also we know. Let's start. Wherever necessary, suitable assumptions have to be made and disclosed by way of notes forming part of the answer. Working note should form part of the answer, but working note is not the answer. Always write your answer first, follow it by working note later. Let's begin. Question number 1. State with reasons whether following statements are true or false. If closing stock appears in trial balance, first of all, closing stock should not appear in trial balance. Closing stock should be shown in the adjustments because it is an event, not a transaction. If in case you write closing stock in the trial balance, you should write both debit and credit. It's little too ugly to write the same amount debit and credit in the same trial balance. So what do? The credit aspect of closing stock, opening stock and purchases debit aspect together will be written as adjusted purchases or cost of goods sold. So if closing stock appears in trial balance, credit aspect of closing stock would be already deducted from purchases and opening stock. So only debit aspect of closing stock should be shown, and that debit aspect should go to balance sheet asset side and it should not go to trading account credit side. We have done this in the topic of trial balance. Also, we would have done this in the topic of final accounts of sole proprietor. Then it does not enter in trading account. Correct. It is only shown in balance sheet. True. The reason is the credit aspect of closing stock, which actually goes to trading account, would have been already adjusted with opening stock and purchases to find cost of goods sold or adjusted purchases. That will be posted to trading account. So the answer is true. Is it true? If closing stock appears in trial balance and credit aspect is already deducted from purchases, making it COGS, debit aspect of closing stock appearing in trial balance will go to balance sheet as an asset. Reason is very important. If the amount posted in the wrong account or it is written in the wrong side of the account, it is called error of principal. No, they have made an error now. So we'll first rectify that error. It is false. It is error of commission. Don't just write what is that wrong amount or wrong account. Also write what is error of principal in the reasoning. Right? The answer is false. Writing wrong amount or wrong account is error of commission. Further, error of principle is recording the accounting transaction with incorrect accounting principle. That is treating capital item as revenue or revenue item as capital. If amount posted to wrong account or it is written in wrong side of the account, then it is called as error of commission. Error of principle is a capital item being treated as revenue or vice versa. For this, next, accounting standards can override statute. No, accounting standards cannot override law. By statute, they mean law. I'll write false. Drawback of accounting standard is that it will reduce the number of options, but it will not make it zero. Further, accounting standards cannot override law. See here, one cockroach is also trying to do see. Hey, no. Okay, come to next one. Promissory note is different from bill of exchange because the amount is paid by the maker in case of former and the acceptor in the case of later. If it is a bill of exchange, you are a seller, I am a buyer. You are a drawer, I am a drawee. You prepare the bill of exchange and I sign. Did I make the bill? No, I only sign, but I have to pay money. I become the payer, you become the payee. So in the case of bill of exchange, you are the maker, I am the acceptor. You are the drawer. I am the drawee. You are payee. I am payer. I should pay you money. However, if it is promissory note, you are seller. I am buyer. You don't prepare. I will only prepare the bill. I will only sign the bill. I will only pay the money. This is a point of difference between bill of exchange and promissory note. They have beautifully crafted and given it here. All that we can do is accept that genuineness and then beautiful answer and then call it true. Yeah, you are right, bro. Bill of exchange, the drawer will make, drawee will pay. Promissory note, I only will make, I only will pay. Because I'm making promise. Promise I'll pay you money. Understood? The answer is true. Then come to next one. All errors are rectified by means of journal entry. Not necessarily. If it is one-sided errors identified before trial balance, then it has to be adjusted by way of adjustment. Only if it is two-sided errors, we pass journal entry. However, in post-trial balance or post-balance sheet stage, we will always pass journal entry with suspense if it is one-sided, without suspense if it is two-sided. The statement that they made that all journal entries will be rectified by journal entries, all rectification errors, all errors are rectified by passing journal entries is false. Some of them are rectified by adjustment. So the answer is false. Not all errors are rectified by journal. One-sided errors before trial balance are adjusted. I hope you got it. Let's go to sixth one. Revaluation account, what we prepare in the case of admission, retirement, death, is also known as profit and loss adjustment account. Yeah, it is to identify all the profit and loss that will arise, but specifically in the process of revaluation, in the process of reconstitution of the firm, admission, retirement, death, or breach of the partnership between the partners, or change in the constitution of the firm because of change in the partnership ratio. In this case, some profits, some expenses, some losses will arise. These are special profits or special losses arising in that special situation. We won't write it to P&L account, we'll write it to P&L adjustment account, which is renamed as revaluation account in this process. I hope you are aware of this. Cool. By this, we're done with 12 marks. Yay. Define accounting policy. Oh, we know accounting policy. These are accounting principles which are applied in the process of preparation and presentation of financial statements. What are the conditions under which a company can change its accounting policy? We read this in Accounting Standard 1. It can be changed only in the case of RCB, requirement by law, change in accounting standard, or for the sake of better presentation. C, P. Accounting policies are accounting principles and methods of applying these accounting principles in the preparation and presentation of financial statements. Same language, word to word, is there in ICAI-style method. Same language, word to word. We will look in the exam. They can't find a reason to cut half mark in our answer. That's how we should write the answer. And what are the examples also you write? Valuation of inventories, method of computing valuation of fixed assets, valuation of impairment loss, and the cost formula. All of this. Depreciation is not a valuation. Sorry, depreciation is not an accounting policy. Then they've asked when can we change? It can be changed when there is change in accounting standard, when there is change in law, or there is requirement by law, or in the case of better presentation. I hope you got it. Come to 1B2. Explain the following. Cash basis, going concern concept. Cash basis is opposite of mercantile basis. What is cash basis? In cash basis, we record the transaction. Only it is affected in cash. You purchased goods today. You paid cash tomorrow. Will you rate the transaction today or tomorrow? Tomorrow. That is cash basis. But as a business, what should we follow? Mercantile or accrual basis. When do we rate the transaction? The transaction of purchase happens today, but the cash is paid tomorrow. We should rate the transaction today. Accrual basis. Record the transaction as and when it happens, not merely when it is affected in cash. Accrual. Cash is opposite of accrual. Then going concern concept. An organization neither has an intention nor a necessity to close down its operation in the near future, or it has an intention to continue the business for foreseeable future. Going concern is a fundamental accounting assumption. If you follow, no disclosure needed. If you don't follow, disclosure is needed. 2 points. Cash basis. Transactions are accounted only when it is affected in cash, not based on accrual system. Going concern, an organization neither has an intention nor a necessity to wind up its operation in the near future. Going concern, same, no? Sir, how do you tell exact same thing? I only type this, no? Whatever is there only I wrote. Whatever is there only it's there here. It's not like I copied from suggested answer and then put here. What I expect you to remember, first I remember. If I can't do it myself, I will not ask you to do it. If I can remember the exact same line, I will then expect you to do. Okay. Done. Then they've given, see, one more, 4 marks done, 16 marks in your pocket. Pass journal entries for the following transactions in the books of Mr. Kapil. Remember 1983? You are not born. Okay, Kapil, they won World Cup there. He's done some transaction. Purchased goods from Sonu for rupees 1,50,000 at a trade discount of 10%. So when you bought it from Sonu, you asked Sonu, Nangenu Ilva. Sonu told, I'll give you 10% discount. Like, okay, from 1,50,000 you deduct 10%, 15,000. 1,35,000 is the actual agreed price. That is the price at which you are purchasing goods. And there is SGST, CGST as 6%. We've discussed this in specific. Do you remember? Should we first deduct discount or should we first add GST? First discount, then GST. For trade discount, there is no journal entry. From 1,50,000 you deduct 10%, 1,35,000. On that, 6% is SGST, 6% is CGST. 1,35,000 to 6%. 8,100 is SGST, 8,100 is CGST. On purchase, there is input SGST, CGST. On sale, there would be output. Are we buying or selling? Buying. In the books of Mr. Kapil. The books of Mr. Kapil. passing journal entries. First one, purchase account debit. How much? I'll write 1,50,000 minus 10%. That is 1,35,000. And I'm getting input CGST, input SGST. Both are my asset. I would debit input CGST, input SGST. How much? 6% on 1,35,000. Both 8,100, 8,100. Whom did I buy it from? I bought it from Sonu. To Sonu, I should pay money. How much should I pay Sonu? 1,35,000 for purchase of goods, 8,100 SGST, 8,100 CGST, everything put together. I have to pay 1,51,200 rupees to Sonu. Sonu will keep 1,35,000 with him, and Sonu will pay 8,100 and 8,100 to central government. Got it? Yeah. Then after that, second transaction. What's happening in second one? Sold goods to Mohit. Okay, we're selling goods to Mohit. For what value? 50,000. And charged SGST and CGST at 5% each. So, is there a discount? No. Out of the amount due, 40% is received by check immediately. We'll write it as two different transactions. We'll not try to combine. I've sold goods to Mohit. Mohit will become my Sundari debtor. Mohit has to pay me money. How much should Mohit pay? Mohit pay 50,000 for goods. Mohit should pay 5% CGST, 5% SGST. Identify 5% of 50,000. 2,000. So Mohit has to pay 50,000 plus 2,500 plus 2,500. Can I say Mohit has to pay 55,000? 55,000. Full money is not supposed to pay because of the goods that I gave. For sales is supposed to pay only 50. 2,500, 2,500, which is SGST and CGST collected. It is output. It is my liability. From Mohit, I collect 55. 50,000 I'll keep in my packet. And then 2,500 I pay to Sidramaya uncle. 2,500 I pay to Nirmala auntie. So SGST, CGST. I hope you got it. Then, is this not very fast? Next one, goods costing 25,000 withdrawn for personal use. Drawings. When the goods are sorry. Out of the amount due, 40% is received by check immediately. How much are we supposed to receive from Mohit? 55,000. 40% of 55,000 he will pay to us by check. I will debit bank account and I'll create Mohit account. 55,000 into 40%, 22,000, 22,000. Balance will remain there only. Alternatively, instead of debiting Mohit by 55 and then crediting him by 22, again, once for all, debit Mohit only by 33 and 22 I can debit to bank account directly. And credit will be same. Sales 50, output SGST 2,500, output CGST 2,500. This is also an acceptable answer. But I would personally suggest you to write two separate entries to ensure that you don't do anything wrong. But writing one single entry is also absolutely fine, accepted and okay. Let's go to the third one now. What's happening after that? Goods costing 25,000 is withdrawn for personal use. Goods issued other than by way of sale. Goods issued other than by way of sale should be credited to purchase account. Because it is drawings, we'll write drawings account debit to purchase. I hope everybody understood. And whenever we take the goods for personal use, when we previously had purchased it for professional use, for the sale purpose, we had recorded input CGST, input SGST. Input on GST can be claimed only and only if you use those goods for professional purpose. Now that you use those goods for personal purpose, input what you had recorded previously should be reversed. Sir, can I write output? No. Output CGST and output SGST will be written only if you sell. This is utilization of goods otherwise than by way of sale. Because you are not actually selling, you will not credit output, you will reverse the input what you had previously debited. So the journal entry will be drawings account debit to purchase. Goods is 25,000. On this, when I had debited purchase, previously when I had debited purchase, I had created input CGST, input SGST. That I'll reverse now by writing 2 input CGST, 2 input SGST at what rate? They mentioned that is 6%, 25,000 into 6%, 1,500, 1,500. Total money that I consider to be my drawings and deduct from my capital will be 28,000. I hope everybody understood 28,000. Going forward, let's see transaction number 4. Machinery purchased by Messrs Bright Industries for 2 lakh plus CGST and SGST at 9%. 1 lakh is immediately paid by check and balance after 2 months. We'll not worry about that second transaction. First, we'll write purchase of asset. What is the name of the asset? Machinery. I'll debit machinery account. Yeah, I'm assuming input tax credit is available. I'll write machinery account debit. When I pay tax, input is available. No, input CGST, input is GST. Credit will be Bright Industries to whom I'm supposed to pay money. What is the value of machinery? 2 lakh. On that, I'll compute 9% CGST, 18,000, 9% SGST, 18,000. Everything together will become 2,36,000. I hope everybody understood this. This is because input tax credit is available. This is because input tax credit is available. If in case on the same transaction, if input tax credit is not available, I would have not written input CGST and input SGST separately. This 18 plus 18, 36 would have been included in machinery. I would have written the entry machinery account debit 2,36,000 to Bright Industries 2,36,000. I hope everybody got this. Fantastic. Please don't sit there and then watch this like you're binge watching Netflix favorite web series. Open your book, open your pen, open your calculator, compute it on your calculator, open the pen cap and write it on the pen. It's okay if you write slightly slow. When you're watching it recorded, reduce the speed to 0.75x and then write. Or if you write half things, it's okay. Writing 70%. Come to the next question with me. Start doing it. Yeah. Don't try to watch the screen. Keep listening to my beautiful voice and then start it. No, it's not. Okay. ಕರ್ಕಶವಾಗಿರೋ ವಾಯ್ಸ್ ಅನ್ನು ಕೇಳ್ತಾ ಕೇಳ್ತಾ ಬರೆಯೋದು ಕಂಟಿನ್ಯೂ ಮಾಡಿ. Let's go to the last one. That's it. Everything's done. So one second. Paid 1 lakh rupees immediately by check. I was supposed to say fifth transaction is not there. I almost got killed. Paid 1 lakh rupees immediately paid by check and balance to be paid after 1 month. How much am I supposed to pay Bright Industries? 2,36,000. I'll write Bright Industries debit 1 lakh. Credit will be bank. Sir, balance after 2 months, 2 months admil banni. I'll write the entry. Yeah, you don't have to write it now. By this, we complete question number 1. 20 marks. Yes. So, you can answer this 20 marks compulsory question only when you know this theory and all. If you don't know, then you're gone. No, 4 marks gone here. And true or false, you won't get marks for writing true. Right? Marks for writing false. You will get marks for writing the reason. If your reason is dabba reason, even though you know true, if you can't justify why it's true, gone. So a lot of them lose marks in big questions. Okay, they lose marks in true or false also. This is because you don't focus on reasoning. Reasoning is very important. If I tell you you are an idiot, I should give reason why you are an idiot. If I don't tell you why you are an idiot, I am an idiot. You get it? So reasoning is very, very important in exam as well as in life. Come on, let's go to the second question. What second question? Second question. Answer. This is answer. Second question. Trial balance of Sarvesh Kumar as on 31st of March 2024 did not tally. Congratulations, the tally did not happen. And the difference was posted to suspense account. Congratulations, they've done good thing. Because there are problems where when the trial balance doesn't tally, instead of transferring to suspense, by mistake they'll transfer to P&L. Other than this 1, 2, 3, 4, 5, 6, 8, 9, 10 journal entries, then you should pass one more journal entry to rectify that mistake. But thankfully in this they've rightly transferred to additional rectification entry is not needed. On a scrutiny, following errors were detected. Have they mentioned next year? No. So it is not stage 3. It can be stage 1. It can be stage 2. They mentioned trial balance is prepared and difference is posted to suspense. How can it be before trial balance? It is after trial balance. So it is actually stage, that is after trial balance before final accounts. After trial balance before final accounts, whether it is one-sided or it is two-sided, we pass journal entry. If it is one-sided, we pass journal entry with suspense. If it is two-sided, I'll write journal entry without suspense. Can we begin? Let's see. The first one. Total of sales return book for January 24 has been casted short by 1,000. Sales is income. Credit increase, debit decrease. Sales return is opposite. Sales return, debit increase, credit decrease. What have they done? They've written all the entries in sales return. They've done error of commission. What have they done? Totaling error. How much did they do? 1,000 rupees less. What do we do? 1,000 rupees plus. Should increase sales return book by 1,000. They have recorded 100 rupees less. Tell me what is the journal entry for sales return? Sales return account debit to customer. That customer gave the goods back to you. Goods will come. Sales return account debit. I have to pay money to customer. Customer credit. So here, customer, there is no problem. Sales return book, there is an error. I will debit sales return because it is debited short. Credit will be suspense. Why? This is a one-sided error, my friend. One-sided error. There is error only in sales return book. There is no problem with debtor account. So why I will assume debtor account is also wrong? Never assume an error. If there is an error, they will tell. If they don't tell, there is no error. If you start assuming like that, assume they've written debtors account instead of 1500 they've written. Assume no. Assumptions, if you start, there is no ending to assumptions. So don't assume an error. If there is an error, it will be given. If it's not given, it's not an error. Fantastic. Come to next point. Freight paid for installation of machine. See, we've discussed this in the topic of depreciation and amortization. Whenever you incur freight, it is directly attributable expenditure. Freight is transportation expenditure from the place of purchase to the place of factory. This should be added to the cost of machinery. Machinery value, you should include this and charge depreciation. What have they done? They have posted it to freight account. This is error of principle. It's a capital expenditure, incorrectly treated as revenue expenditure. It should have been added to asset. They've wrongly returned to P&L. So the mistake that they've done is they've wrongly debited freight account, which should have been not debited. I will credit freight account. They've wrongly debited freight, which they should have not debited, so I credit freight. They should have included it in machinery by debiting machinery. They have not debited in machinery, I will debit it. Simple journal entry for rectification. Machinery account debit to freight inwards account. How much is the machinery account? Oh, wait. Freight paid is how much? 6,500. This was supposed to be debited to machinery. They have not debited. I debited. First error. They've wrongly written to freight. No, they did not stop there. Amount also they wrote wrong. They should have written how much? 6,500. They have written how much? I'll reverse freight account by 5,600. There is difference of 900 that will go to suspense. So they have incorrectly debited freight inward. I credited it. They were supposed to debit machinery. They have not debited. That also I did. There is difference in the amount that I have transferred to suspense. By this I have rectified my second error. Let's now go to the third one. Goods of sale value 2,500 returned by a customer. Customer has returned the goods were entered in sales day book. I've entered in the sales day book. If I've entered in the sales day book, it would go, wait, it's goods returned. They should have entered in sales return book. Share. When the customer gives the goods back to us, I should write in sales return book. I wrote in sales. If I write in sales, sales would be wrongly credited. Total of sales day book will go to sales account. No, I've wrongly increased my sales. I should now debit sales. Why? I should decrease my sales. It's wrongly included in sales day book. Sales has gone up. I should decrease sales. How do I decrease sales? Debit it. They should have recorded where? Sales return book. They have not recorded in sales return book. Record in sales return book also. Sales return also debit. Sales also debit. Understood? Wait. Have they done a mistake in customer account and posted therefrom to credit office account? Tell me what is the journal entry for sales return? Sales return account debit to customer. Customer should be credited. They have correctly credited customer. But instead of writing in sales return book, by mistake they wrote in sales. Wrongly they have credited sales. Because of which sales has increased. I'll reverse it by debiting sales. It should have been recorded in sales return book. They have not recorded in sales return book. I will record in sales return. There is no error in amount. I will write amount 2,500, 2,500. 5,000 will be credited now to suspense account. By this, I'm done with rectification of adjustment 3. I'll now take you to fourth one. Can I read the fourth one? 18,000 paid for purchase of old motorcycle for personal use of Sarvesh Kumar was debited to conveyance. Sarvesh Kumar has bought one old motorcycle. It is his personal expense. It should be paid from his personal pocket. It is not a business transaction, but he used business money to pay. When business money is paid, it is like he's withdrawn the money and then is paid. The transaction here is money withdrawn from business for personal purpose. How much is the amount withdrawn? 18,000. What is the journal entry when you withdraw 18,000? Drawings account debit to cash. Drawings account debit to cash. Later you would have to write that that motor vehicle purchase in your personal books. You should have debited drawings. You should have credited cash. They have wrongly debited it to conveyance. Conveyance means transportation expenditure. They should have debited drawings. They have not debited drawings. We will debit drawings. They have wrongly debited conveyance. They should have not debited conveyance. We will credit it. They should have debited drawings. They have not debited. We will debit it. They should have not debited conveyance. They have wrongly debited. We will credit it. Journal entry will be drawings account debit to conveyance. I hope everyone got this. Fantastic. By this, we're done with the fourth one. Let's now go to the fifth adjustment. Purchase of rupees 6,700 had been posted to creditors account as 6,000. We purchase goods of 6,700. What is the journal entry when we buy? Purchase account debit to creditors. 6,700, 6,700. How much did I write to creditors? 6,000. Balance 700, who will write? We should only write. We have not written. Now we will write. Credit or debit? Creditors are supposed to be credited. I have not credited. Meaning, we're supposed to be credited by how much? 6,700. But I have credited by how much? 6,000. Shall I credit the balance 700 now? Balance 700, what they had not credited, I'll credit now. Debit will be suspense. Because I will not assume that there is an error in purchase unless they mention. There is no error in purchases. The problem was only with creditors account. Next up, after this, receipts of cash, rupees 5,000 from Mr. Avinash. When you receive cash from Avinash, entry is cash account debit to Avinash. How much? 5,000, 5,000. Was posted to debit office account. We should debit cash and we should credit Avinash. What have they done? They've debited Avinash. Did they mention anything about cash? What is your assumption? They've correctly recorded cash. There is no error in cash. Avinash account should have been credited. What have they done? Wrongly debited. That incorrect debit I have to reverse. So I will credit. That correct credit I have to record. So again I will credit. Actually I will do double impact. 2 times the credit amount. How much? 5,000 plus 5,000. 10,000. I'll repeat. Avinash was supposed to be credited. It is not credited. I will credit. It was incorrectly debited. To reverse the incorrect debit, I'll credit once. To record the correct credit, I'll credit once. So I'll credit it by 2 times of 5,000, which is 10,000. Debit will be suspense account. Here I forgot to tell. This is 700 here. I hope you all got this. Very good. Let's go to seventh one. What's happening in seventh one? A check of rupees 2,500 received from Mr. Alok has been dishonored. Oh my God. And was posted to debit of Ashok. When the check is dishonored, we would have to write the entry. You gave the check to bank. Bank account debit to Alok. When the bank gives the check back to you, bank balance will decrease. Bank account credit. Debit will be Alok. I have to give it back to. I should debit Alok. What have I done? Ashok. Oh, ill and dis. You understand? I was supposed to debit Alok. I have wrongly debited Ashok. Debit because the check what Alok gave is dishonored. I'm supposed to recover money from Alok. How much? 2,500. Because Alok did not pay money, I'm supposed to debit Alok, but instead of debited Ashok. Ashok was wrongly debited. Credit Ashok. Ashok was wrongly debited. Credit Ashok. Alok was supposed to be debited, but it is not yet debited. Debit Alok now. I was supposed to debit Alok. I have not debited. I'll debit now. I had wrongly debited Ashok. To reverse it, I will credit now. That's the end of seventh one. Come to eighth one. Sale of rupees 8,500 to Mr. Deepak was recorded in sales book correctly, but while posting to ledger, credited to his account. What is the journal entry for sales? Debtor account debit to sales. What is the journal entry for Deepak? Deepak account. Deepak is our debtor. What is the journal entry for sale? Deepak account debit to sales. In Deepak ledger, I should write to sales. In sales ledger, I should write by Deepak. What did we do? It was correctly recorded in sales book. While writing in the ledger, while posting in ledger, credited to his account. In his account, we should debit, no? We are supposed to receive money from him. He's our asset. We were supposed to debit. First, we did not do debit. So we will debit. Second, we did wrong credit. To reverse that credit, I should do debit again. I should have written on the debit side. I have not written. You will write. I have wrongly written on the credit side. To reverse that again, I'll write on the debit. So I should debit his account by double the amount. How much? 17,000. 8,500 plus 8,500, 17,000. Credit, suspense. There is no problem with any other ledger. There is no problem with any other. I hope you understood the eighth one. Let's go to ninth one. Total of discount allowed column in the cash for the month of December 2023 amounting to 3,800 was not posted. Should post no total of discount allowed, debit it. That's it. Credit will be suspense. Easy. Being discount allowed now rectified. They had previously done an error. Last one, sale of old office table for rupees 2,200 is treated as sale of goods. It is asset sold. What is the journal entry when you sell the asset? Cash account debit to asset. What is the journal entry when inventory is sold? Cash account debit to sales. So basically they should credit asset. They've credited sales. Sales is wrongly credited. I'll reverse it by debiting sales. I should credit office table. I have not credited. Now I'll credit. You can write the entry as sales account debit to office table or sales account debit to furniture. It's up to you. I'll write sales account debit to furniture. How much? 2,200. There is no GST adjustment in this, so I'm not reversing any GST or anything like that. That's it. You are required to pass necessary journal entries with narration to rectify above errors. Done. How many marks? 12. 32 marks down. Let's go to next one. 75%. 32 marks is 75%. In which way? Oh, remaining. Okay. On 1st of April 2022, LMP company, which depreciates its machinery under diminishing balance method, WDV, had rupees 9,72,000 on its debit balance. Oh, they have given data from 2022. We might have to recompute it from earlier than that. Anta can't satte. They'll give in the middle of there, but we'd have to do it from previous date because a portion of it will be sold. This is total. I remember this kind of question. 9,72,000 is in which year? 22, 23. And 1st of October 22, same year, part of the machinery which was purchased on 1st of April 20 was sold for 80. Sorry, which was purchased for 80 was sold for, see, they have given 80,000 original cost. When? 1st of April 2020. So our working note starts in 2020. In 2020, I'll write 80,000 for that asset. Depreciate for 2021, 21, 22, 22 half year. 23 I won't do full. April to September, 6 months. 2.5 years if I depreciate, I'll get to know the book value, which is sold for 45,000. Are you getting it? Then also another new machinery of 1,50,000 is purchased in 22. So after we sell that old asset, we purchase another new asset on 2022-23, and you spent 8,000 on installation. Company changed the method. Change the method of depreciation from WDV to SLM. When? With effect from 1st April 2020 and adjusted the difference on 31st March 2023. This examination, this question is incorrect. You cannot change the method of depreciation retrospectively. You cannot change the method of depreciation retrospectively. So this is one wrong question which if you have attempted, you might have got marks. This we are not trying to spend time and energy. Why do you spend time and energy to learn some question which is actually incorrect? You cannot do. Grace marks will be given if in case you attempt it and then tell this has to be done prospectively. For writing wrong answer, you will get marks. Why do we have to spend time and energy on this? There's a better thing, better question that we can do. Keep this on hold. I mean to say, share silence. I know what I'm doing. Change in the method of depreciation has to be given prospective effect. They're changing the method of depreciation now. They're telling that it will be given impact to from 1st of April 2020. If I do like what they're trying to tell, I am doing something which was there 6 years ago. That is under old accounting standard in fixed assets and old accounting standard 6 depreciation, which is incorrect. If I have to do in the present time, I should not follow what the question says. When this question was given, there was a lot of like what you're doing only in the YouTube and everywhere students were shouting. If in case you'd have attempted either ways, you would be given marks. You would have to mention that it can't be done retrospectively, it has to be done prospectively. When we are spending time, let's spend time in doing what's right. If I write it under prospectively, then you'll say, sir, they've told change from 2020, you did from 2023. You'll ask the same question again in the comments. If I do change it from 2020, again you'll ask, sir, why are you doing it retrospectively? So I'm telling you, this was a mistake question. Don't make such a big thing about the mistake. Humans, yeah, they do mistake. Institute made a mistake, gave a question, it's okay. Don't make a big fuss out of it. Move on. Exam ali hangagala. Adre marks kodtare. Don't worry. Grace will be given. Let's go to next one. We're skipping it intentionally. Come to next one. See, they've also given alternative 1, alternative 2. Are you getting it? See, retrospective effect, prospective effect. But if in case we follow prospective effect, no, then it will be wrong. See, they only told ignoring the retrospective impact of change if the machine is disposed of. They only mentioned retrospective. They're telling if you ignore and then do how the answer will be. This is covering up the mistake that had actually happened. So don't try to amplify and then show it. This would not be the case. They take necessary action and care to ensure that mistake should not happen. But sometimes it does happen. Yeah. Even alternative 3 also they've given. One question, give more answer. Yeah, Krishna, after making the promise that he'll not touch the weapon, he also, by mistake, almost lifted the cartwheel and then threw it at Bhishma at one point. So, mistakes do happen. Not by you and me, by God also. Yeah, if you doubt, just look in the mirror sometimes. Come on, let's do question number 3. Receipts and payment account of Vandana Sports Club for the year is given. So, they've given receipts and payment. They've given opening and closing balance. So basically, they're expecting us to do income and expenditure account and balance sheet. Anyways, let's confirm that by reading the question. See, they want us to prepare income and expenditure account. They also want us to prepare balance sheet. Shall we do income and expenditure account followed by balance sheet? Yes, let's do that. So first, I'll tell you how to approach this question on NPO. Identify the items which are given in adjustment. Make a small marking. Remember that these items have adjustment so that you'll open ledger for them. Skipping ledger looks like saving time. No, it's going to cost you a lot of time if you skip ledger. To be precise, whenever you skip ledger and try to do some shortcut, it will cost you 3 months extra. Tried and tested. Don't try to save 3 months. Sorry, don't try to save 10 seconds at the cost of 3 months. Please open ledger. Salary outstanding, some items are given. Here on the payment side, you have salary, put 1 star. For salary, we'll open 1 ledger. Don't try to do plus minus. Plus minus is nonsense way of doing. Plus minus will work in mathematics. In mathematics, when QA class, did you ever learn debit credit? No. In accounts class, don't do plus minus. Adalli ಇದು ಇಲ್ಲಿ ಇಲ್ಲಿ ಹಂಗ್ ಮಾಡಬಾರ್ದು ಅಲ್ಲಿ ಹಂಗ್ ಮಾಡಬಾರ್ದು. Outstanding rent and electricity. Do you see in payments anywhere rent and electricity? Simple. Open 1 ledger. Okay. Then investment 8% bonds. Opening closing same. There is nowhere in receipts and payment also investment. Do you have anywhere? No. Ignore. Then interest accrued on bonds. Do you have something here? Interest on investments? 1 star. We'll open 1 ledger for this. Ledger will look like it will take more time. It will not. It's just that instead of writing plus minus, we'll write debit credit. It will look big, but it's the same. Plus minus, you write it close. No. Ledger, it will show big, but it will not take extra time. Then tested in the class. Half the students with ledger, half the students without ledger, solve. Let's see. Everyone will take the same amount of time to finish. It's just that you are a little reluctant. Become an accountant. Subscription receivable, subscription received in advance. Do you see subscription on the receipt side? Open 1 sweet cute ledger for subscription. 1 star, saying that this item has adjustment. Then you have something called furniture. Opening is there, closing is not there. In receipts or payment, do you have anywhere furniture? Nothing. Nowhere. Okay, we'll compute depreciation and find the closing balance. Sports equipment, we have some small item here. See here. We'll open 1 cute ledger for sports equipment. What's after sports equipment? Library books. Library books, any purchase, any sale, any purchase, any sale. Yes. Payment is there. So basically we purchase library books. I'll open 1 ledger. I'll write the opening balance. I'll add the purchases that is on the debit side. I'll write the closing balance on the credit. If there is a balancing figure, that would end up becoming depreciation on library books to be returned to income and expense. Then by this we are done with all the balances. Furniture and sports equipment are to be depreciated. I'll put 1 star next to furniture. Furniture. I should charge depreciation to find closing balance. Same with sports equipment. Anything else? Then they've told library books revalued and they've given the revaluation figure. Entrance fee is to be capitalized. Whatever entrance fee is there, don't take it to income and expenditure as income. Take it to balance sheet fund, capital fund. 60% of it, not full. On the receipt side, you have entrance fee, 1 star. We're done. Can we now start with the answer? I made the markings as to what items has adjustment and what items did not. They're asking us to do income and expenditure and balance sheet. Income and expenditure is like your P&L account. Balance sheet is balance sheet. In balance sheet, to close balance sheet, I need opening capital. To find opening capital, The data is not available in the question, so I'll open opening balance sheet. They have actually asked income and expenditure and closing balance sheet, but I'll prepare income and expenditure and closing balance sheet as the answer. In my working note, I will prepare opening balance sheet also. Alongside with opening balance sheet, I might have to open furniture, sports equipment, subscription, entrance fees, interest on investment, salary, rent and electricity, ledgers. And remember, those are working notes. They form part of the answer. They are not the answer. So, first page your answer. First page of your answer will be income and expenditure account. Full page. Second page of your answer will be closing balance sheet. Third page of your answer will be opening balance sheet. Third page, that opening balance sheet is working note. After that, all the other ledgers will come in page number 4 and onwards. Open only 2 ledgers in one page. First half one ledger, second half another ledger. Why? What if you leave 4 lines for one ledger, but that ledger has 6 items? You don't have sufficient space. Then you don't know what to do. You scratch and then write at the end. Instead, half page one ledger, half page another ledger. If lines are extra, let it be. It's absolutely fine. Paper will get wasted. Don't worry, the tree is already cut. There's nothing that you can do by saving one paper. If you're too environment friendly, leave space and then write and pass in one attempt. If in case you don't pass in one attempt, you write exam again, because of you, one more tree will be cut to make your admit card, to make your question paper, to make your answer paper. Yeah, sir, paper. You pass fast and from your articleship stipend, donate to tree. Growing trees. Later. Then balance brought down. Cash in hand, cash at bank. 5,200, 35,500. Both are basically my asset. I would have to write in my opening balance sheet. First page, income and expenditure. Second page, closing balance sheet. Third page, opening balance sheet. On the asset side, I'll write first page, second page, third page. On the asset side, what would I write? Cash and bank. How much? 5,200 plus 35,500. Together, 40,700. Full amount written. Then subscription. I will not think. I'll blindly open ledger. Are you getting it? Doing ledger will make subscription such an easy item. Not doing ledger will make simplest of subscription computation to be very, very difficult. So in my receipts and payment account, I'm writing to subscription. In page number 5, subscription ledger, I'll write credit side by income, receipt and payment. 2,95,000. I've done. Whenever I get opening closing balance, I'll think asset liability. Asset opening balance debit, closing balance credit. Liability opening balance credit, closing balance debit. When I write it, automatically I'll get income and expenditure as balancing figure. If you don't do it, you'd have to think this to add, that to deduct, to that to deduct, to this to add. And sometimes plus will become minus, minus will become plus, depending upon what you start with. Why so much computation? Why so much complication? Life is simple with debit and credit. Then entrance fee 50,000. In my entrance fee, usually entrance fee will go to PL. Here they have told part of it is to be added to capital. I can open one ledger, but this one item, because it is simple, in income and expenditure, income side I'll write entrance fee, but not full amount. What is the amount? Amount is the amount there, 50,000. I'll write 50,000 in inner column. Part of it will be income, part of it will be capital. Later I'll read the adjustment and do. Now don't jump to adjustment. Solve the question in the order in which the data is given in the question. Don't do it in some haphazard manner. I hope you got it. What is after this entrance fee? Miscellaneous income. No adjustment. What does it mean? It is received. It is income. If there is mismatch between receipt and income, it will be asset or liability. But right now, income 19,850. Page number 1. Done. Next, interest on investments. There is an adjustment, meaning part of it is received, part of it is not. We'll open one cute ledger, interest on investment. In receipts and payment, I've written 2 interest. In interest account, I'll write 5 receipts and payment, 8,000. I hope you got it. Page number 5, no? 1 income and expenditure, 2 balance sheet, 3 working note balance sheet, 4th page. 4th page, second ledger. Done. What's after this? Then come to payment side. Salaries, 1,55,000. Salaries are paid, but there is a star. Open one salaries ledger in the next page. In receipts and payment, you return by salaries. In salaries, you will write 2 receipts and payment. 2 receipts and payment. How much? 1,55,000. I hope you got it. Next, In receipts and payment, you return by rent and electricity. So we'll open one quick ledger called rent and electricity. You'll write 2 receipts and payment, 69,750. Next, I have library books, 10,500. In my receipts and payment, I've written by library books. In library books account, I'll write 2 receipts and payment, 10,500. Just go on opening ledger and then write. Thinking will become less. Computation will become easy. After library books, then I have newspaper and magazine. There is no adjustment. You have paid money, means it is expense. You have paid money, means it is how much? 16,600. Page number 1. In income and expenditure, you will write expense 16,600. Come to income and expenditure, write newspaper and magazine 16,600. Done. Then we have with us sports equipment. Sports equipment 28,500. There is an adjustment. So I'll open one ledger. If I don't open ledger, one item is here, one item is here, one item is here, one item is somewhere else. 4 items I should process at once. Instead, one ledger. Ledgers is the spirit of accounting. Ledger illa andre nave illa. In receipts and payment, I have written by sports equipment. In sports equipment, I'll write 2 receipts and payment, 28,000. Yeah. Accounts are made of ledger. Sundry expenses, there is no adjustment. What do I do? Straight away write in income and expenditure as expense. How much? 71,050. Annuvudu prema Allah. Right here to sundry expenses. 71,050. I hope everybody got this. What do we have after sundry expenses? 71,050. Balance carried down. This is the assets closing balance. Cash in hand 8,750. Cash at bank 53,400. Total them 62,150. Closing balance of the asset in my balance sheet. On the asset side, I would write cash and bank. 62,150. This is closing balance sheet as on 31st of March 2024. Good. Snoop Dogg. Okay, by this we're done with receipts and payment. Let's now go to assets and liabilities. Salaries outstanding. How much is the opening? 10,200. How much is the closing? Salaries outstanding is liability. So credit side opening balance, debit side closing balance. Do you get it?
Yes.
Yeah. I'll go to salary. Ledger is already there. See, I did not even remember how much was paid. If not, I had to remember everything. Now, chill. Keep your mind chill. Buy. Balance brought down. 10,200. 2. Balance carried down. 12,400. Don't close it now. We'll come back later. Balancing figure, if you find, it will be receipts and payment or income and expenditure, whatever is not there. One small hack for you to know. Every ledger will have opening balance, closing balance, receipts and payment, income and expenditure. Every ledger will have opening balance, closing balance, receipts and payment, income and expenditure. 3 things will be known, 1 thing will be not known, we will find. Here there is opening, there is closing, there is receipts. Balancing figure, income and expense. If income and expense is there, receipts and payment would be balancing figure. In such question, they would give income and expenditure in the question, receipts and payment should be found. Got it. Don't close salary account now. All the ledgers will close at the end. Keep all the ledgers open. Why? If you close salary account, later you will come across another adjustment. Then what to do? Salary advance if they give. Don't risk. Then come to next one. Outstanding. Hey, one second. You should write now 10,200 and 12,400 in balance sheet. You'll write it in balance sheet. Opening balance sheet. Salary outstanding. Liability. How much? 10,000. And in my closing balance sheet, I would write salary outstanding. How much? 12,400. So salary is correctly written in opening as well as closing balance sheet. Then let's go. Outstanding rent and electricity. Outstanding rent and electricity. Opening 6,500. Closing 7,600. I've already opened one ledger. It's a rent account. Shall I write it there? This is a liability. I'll write it in opening and closing balance sheet also. Opening balance sheet 6,500. Closing balance sheet 7,600. This is my closing balance sheet. I'll write here outstanding rent and electricity 7,600. This is not 6,7. This is 7,6. Then I'll write in my opening balance sheet. Outstanding outstanding rent and electricity, 6,500. Next, have you opened one ledger, rent and electricity, rent and here. Buy balance brought down. How much? Opening, 6,500. Two balance carried down, 7,600. Done? Shabash. What's after that? Investment. It's an asset. 8% government bond. How much was opening? How much is closing? Last year, how much was it? Same is this year also. No purchase, no sale. 1 lakh opening balance sheet, 1 lakh closing balance sheet. Shall I write? 8% government bonds in asset side. Like a bond investment, 1 lakh. Even in the closing balance sheet, I've written it. Opening balance sheet also, I'll write bond 8%, 1 lakh. 8% of 1 lakh is how much? 8,000 is interest income. If you have 1 lakh investment from the beginning till the end, on that 8%, 8,000 is my income, no? In my income and expenditure, I should write income. How much income? 8,000. This is compulsory. Whether you receive or you don't receive. Some of it is received, some of it is not. Receipts and payment tally, some interest is there. You actually open one ledger. Come check it out. Do we have a ledger by name interest?
Yes, sir.
Where is it? Where is it? Interest here. In income and expenditure, I wrote on the credit side, no, by interest. In interest account, I'll write debit side to income and expenditure 8,000. How much is received? 8. How much is my income? 8. You're like, hey, sir, no adjustment. No, there is opening and closing balance. Oh, that's the reason you should open ledger. We'll adjust it later. Offset opening and closing balance given in the table. For now, you write it in this ledger and then wait. What's after that? Interest accrued on bonds. How much is accrued? Opening 2. Closing 2. 2, 2. 2, 2, 2, 2, 2, 2, 2. It is an asset. Interest earned but not received. So I'll write on the debit side opening balance. Ledger is automatically closed. Where do I write this 2,000? Asset. Opening balance sheet asset side 2,000. Closing balance sheet asset 2,000. Did you all understand this? Say something. Closing balance sheet interest accrued asset 2,000. And opening balance sheet I'll write interest accrued 2,000. Then subscription receivable. Subscription receivable is asset. Asset debit balance. In subscription account, debit side opening balance 18,700, credit side closing balance 2,600. Also post this to balance sheet. Opening balance sheet 18,700 asset side, closing balance sheet 2,600 asset side. Can I write it? Help me. Opening balance sheet, subscription receivable 18,700. Closing balance sheet, subscription receivable 20,600. Done? Scroll down, down, down. Subscription account. What do you write in my subscription account? 2 balance brought down. Opening 18,700. 2 balance carried out. Closing 20,600. Did you guys understand this?
Yes, sir.
Fantastic. I hope you guys got it. Let's proceed. What's after this 18,700, 2,600? Subscription received in advance. Subscription is received in how much? 7,000 opening, 8,400 closing. Received in advance is pre-received subscription. You have received it before earning. It's a liability. You have received it before earning. It's a liability. Opening balance sheet 7,000, closing balance sheet 8,400. In subscription account, credit side by balance brought down 7,000. Debit side to balance carried down 8,400. Done. Shall I read it in my respective balance sheet also? Say something. Let's go to balance sheet, opening balance sheet. Outstanding subscription or advance subscription, opening balance sheet 7,000. In closing balance sheet, 8,400. Done. Subscription account without moving a spoon, without being worried. Everything's done. You automatically find balance and figure, it becomes income and expenditure. Opening is there, closing is there, receipts and payment is there, balance and figure is income. You are mugging up, no? Opening, add, closing, deduct. Sometimes closing, add, opening, deduct. Why break your head? Debit, credit. Simple to do. Without realizing what you're doing, you'll do. Common problem, people think, sir, ledger is lengthy. See, after one item, I have left 2 lines. After one item, I have left 2 lines. After one more item, I left 2 lines. One total line, one particular line. So it looks lengthy. If I write all of them together, it will come to only this much. They're all standing with one arm distance, sideways and then straightways. So it's looking big. If they all stand for a group selfie, it will come to a very small photograph only. So it will not take more time. You don't have to draw design line. Just have to write the amounts correctly. I told you on the hack, no? What is it? In every ledger, there will be opening balance, closing balance, receipts and payment, income and expenditure. Three things if it is there, find the fourth one. In this opening there, closing there, receipts and payment there, income and expenditure, balance and figure. Anyways, we'll do it later. But I'm just giving you one heads up. Then furniture. How much is opening? Closing they have not given. We will find. We will do depreciation and then find it. I'll write it in the balance sheet. Opening balance sheet, furniture 65,500 outer column. In the closing balance sheet, I'll write furniture 65,500 in the inner column because we have to deduct depreciation on the same. Have we opened ledger? Yeah. Opening balance 65,500. Not needed. You can write there and then close. This item I agree. You can skip the ledger. But anyways, to be doing it in a detailed way, I'll still do it. What's after furniture? Then we have sports equipment. How much is the opening balance? 41,000. We open one ledger for sports equipment. I'll write balance brought down 41,500. And this I'll write it in my opening balance sheet as an asset. Come to opening balance sheet, which is there in page 3. I'll write sports equipment 41,500. In closing balance sheet, I have to write sports equipment, but I don't know the amount. I will find it in my ledger and then write it. I hope you guys are getting it till here. Then what's after that? Library books. How much is the opening library books? 22,000. How much is the closing library books? 0. I'm going to say they have not given. It's not 0. We should find it. In the opening balance sheet, which is there in page number 3, I'll write library books 22,000. In the balance sheet closing, I would have to identify how much is library books. But I don't know. There is some purchase, there is some revaluation. What to do? Simple. You open one ledger, asset opening balance. You will write on the debit side. To balance brought down. Automatically already purchase is there. You don't have to remember. If you don't do ledger, you have to remember how much is purchase. You scan through the question 2 times, 3 times. Waste of time. So automatically you will add them. Identify depreciation if there is any. Identify the closing balance. Depreciation will go to income and expenditure side. Closing balance will go to balance sheet as asset. What's after that? All the asset opening and closing balances are done. Assets and liabilities opening closing balances are done. Closing values of furniture and sports equipment are to be determined. After charging depreciation at 10 and 15 with Maryadi. 10 for furniture, 15 for sports equipment. 10% for furniture, 15% for sports equipment. Furniture. How much depreciation? 10%. By income and expenditure, 6,550. And I'll find the closing balance. How much is it? 65,500 minus 6,550 will give me 58,950. In my furniture account, I'm writing by income and expenditure. In income and expenditure, I should write to furniture. How much? 6,550. And 58,950 will be shown as an asset in the balance sheet. Which balance sheet? Closing balance sheet. Shall I write it? In income and expenditure, on the expense side, I would write here to depreciation on furniture 6,550. 58,950 was the closing balance of furniture. Am I right? Since that my asset, I will take you to my balance sheet. On the asset side, furniture 58,950 closing balance. Done. What's after that? After this, I need to depreciate sports equipment by 15%. Come on, let's do sports equipment depreciation. How much is opening? 41,500. How much did I buy? 28,500. I'll assume that the purchase happened in the beginning of the year. When did I buy 28,500? At the beginning. So do 41,500 plus 28,500. On that you compute depreciation 15%. 10,500. Then we'll find the closing balance. Here you'll write 70 minus 10,500 will be 59. 10,500 in subscription in sports equipment account I written by income and expenditure. In income and expenditure account I should write two sports equipment 10,500 and 59,500 will appear in the closing balance sheet as an asset. I hope everyone's getting it. Come on, let's go. Let me write it in my income and expenditure as 10,500 depreciation. Page number 1. Depreciation on sports equipment 10,500 together 19. Ouch. Library books is also there. You understood 10,500 sports equipment depreciation. And in the balance sheet in page number 2, sports equipment balance is now known 59,500. We are done. Sleeping. Awake. Everybody, make some noise. Did you understand? The club's library books are revalued at the end of every year. And the value as at 31st March 2024 was 30,000. What is the value of the library books at the end? 30. They made it easy. In the balance sheet, you should write library books as 30. In the ledger, library books, closing balance. It is how much? 30. Here it is 32,500. It is saying that it is 30,000. So can I say depreciation is 2,500? I told you opening, closing, receipts and payment, income and expenditure will come in every ledger. Here opening is known, closing is known, receipts and payment is given. Balance in figure is income and expenditure. Got it? So in library books, I wrote income and expenditure 2,500. In income and expenditure, first page, I'll write library books depreciation 2,500. Everything together will become total depreciation of 19,550. I hope everybody got this. Can I take you forward? What's after this? 60% of the entrance fee is to be capitalized. So how much is entrance fee here? 50,000. In that, how much is to be capitalized? 60% is to be capitalized. So 60% will go to balance sheet. How much will appear here? 60% is to be capitalized. Am I right? I'll write less capitalized. How much? 60%. How much is that? Minus 30,000. Can I say if you deduct 30, this will become 20,000? And how much should I write in my balance sheet? That way, 30. Because 30 is transferred to balance sheet. No. I'll write 30,000 in my balance sheet. In balance sheet, you have capital fund, which is yet to be found. You don't know. Where will you find this? As a balancing figure in the opening balance sheet. To this, I will add entrance fee capitalized to the extent of 30. I'll add current year surplus or deduct current year's deficit. That's how I'll find my closing capital fund. I hope you're getting it. What's after that? Then that's it. Entire question is over. 12 marks. What to do? Close each ledger and then post. Income and expenditure, opening balance sheet, closing balance sheet, don't touch now. That we'll see at the end. Leave income and expenditure in page 1, closing balance sheet in page 2, opening balance sheet in page 3. Come to subscription. What is missing? Opening balance, check. Closing balance, check. Receipts and payment, check. Find income and expenditure. That is the current year income. 2,95,000 plus 7 plus 2,600. 3,22,600. From that, deduct 8,400 and 18,700. 2,95,500. In subscription account, I have written 2 income and expenditure. So in income and expenditure account, I would write by subscription account. 2,95,500. Done. One ledger down. Don't close income and expenditure in page 1, balance sheet in page 2, balance sheet in page 3. Come to the next page. Subscription done. Come to interest. Already closed. You don't have to close. Salary, we will close. I told you to check 4 items. What are they? 1, opening. 2, closing. 3, receipts and payment. 4, income and expenditure. Opening is there, closing is there, receipts and payment is there. Balance in figure will be income and expense. How much? 1,67,400 minus 10,200. 157,200. In salary, you wrote by income and expense. In income and expense, you will write to salary. How much? 157,200. Here you will write to salary. 1,57,000. Everybody got this? By this, we are done with subscription, interest, salary. Come to rent and electricity. Rent and electricity. Opening is there, closing is there, receipts and payment is there. Balance in figure will be income and expense. 77,350 minus 6,500. 70,850. I'll write 70,850 in rent and electricity account credit side by income and expenditure. In income and expenditure debit side to rent and electricity 70,850. Page number 1 to rent and electricity 70,850. Can I go to next ledger? The ledger after rent and electricity. The ledger after rent and electricity is library books. Already closed. Sports equipment. Already closed. Furniture. Already closed. Question 3B. We'll go there. Wait. So by this we're done with everything. What to do? Close your income and expenditure. Identify excess of income over expense or excess of expense over income. Surplus or deficit. Post it to closing balance sheet. Don't close there. Close opening balance sheet. Find capital fund. Write it to closing balance sheet. Done. Help me find the total on the credit side here. 3,43,350 minus 2,90,400, whatever you had computed as total expense, will give you excess of income over expense, which is surplus. 8,100. In income and expenditure, you return on the expense side. This is like profit. Add it to the capital fund here. Closing balance sheet. We don't know how much is the opening capital fund. How do we find opening capital fund? Very easy. Come to close your balance sheet. Opening balance sheet. Take the total on the asset side. 2,90,400 minus 10,200 minus 6,500 minus 7,000. 2,66,700. Am I right? Akka? Check once. You get 266,700. 266,700 is capital fund, which will write it to opening balance sheet. Add 30,000 entrance fee. Add 8,100 surplus. Three lakh 4,800. Add 12,400, 7,600, 8,400. We'll get the total of liability side. 3 lakh. Check the same on the asset side also. Give me the good news that the balance sheet is telling. Yes. ಇದಕ್ಕೇನಂತೀರಾ ಮಿಸ್ಟರ್ ಸೂರ್ಯ? ಇದಕ್ಕೇನಂತೀರಾ? ನಮ್ ಬ್ಯಾಲೆನ್ಸ್ ಶೀಟ್ ರೀ ಇದು. ನಮ್ ಬ್ಯಾಲೆನ್ಸ್ ಶೀಟ್ ನಾವು ಕಷ್ಟಪಟ್ಟು ಮಾಡಿರೋದು. See, now you remember also which question had come where. Next time in your exam, you get one question. You're like, this question was there in September 25 RTP. Same question. Why do you write? No, write it. Yeah. Don't write reference there. This was there in page number 8 in my book. Left side, right side, one box was there. There one flower was there. There one mosquito was there. There one sambar drop had fallen down. Don't write all that. Write answer if the question comes. Yeah. Even if the numbers are same, compute on the calculators. Don't be like, I know this balance sheet total. It was 3,33,200. Don't write. Compute. I hope you understood this. By this, we are done with 2A. We have 2B. 2B. Shall we do 3A? 3B. So we've done with 40 plus 12. 40 plus 12, no? 52 marks. We are not aiming to pass. Yeah. You are not chasing 52 runs. We want 100. 100 hundreds if you have to do. 100 hundreds if you have to do. You have to score century every game. Okay. Come on, let's do this question on partnership. Are you ready? P, Q, and R. It's work partners. There is an R missing. Partners sharing profits and losses in the ratio 3:2:1. They decided to dissolve. Oh, dissolution of partnership firm. They've decided to dissolve the firm. Ayyo, papa. We should do realization account. Anyway, see at the end, what have they told? Prepare realization account. Prepare cash and bank account. Sir, balance sheet. When the firm is dissolved, there is no balance. What balance sheet will you prepare? They've asked you to prepare partner's capital account in the books of the firm. 8 marks. Can we begin? Close all the assets by transferring to realization. Close all the liabilities by transferring to realization. All the assets and the liabilities, whether taken over or not, should be transferred to realization. Exception, 2 things. Share capital and reserve should be transferred to, partners capital and reserve should be transferred to partners capital account. Cash, if there is any, open one separate ledger for cash. I hope you understood. Let's begin with capital. P, 3,55,000. Q, 2,20,000 or 1,25,000. I'll open partners capital account. First page, realization account. Sir, space, don't try to adjust. Leave first page completely for realization. Don't do jugaad there. Second page. Okay, now talking about preparation of partners capital account with 3 partners. Page space might not be sufficient. Can I have your book? 1 second. Please come here. Sorry, don't feel bad. Hope iದ್ರೆ ಸರ್ ಮೇಲೆ ಹೊಡೆದ್ಬಿಡಿ ಭಯ ಎಲ್ಲ ಪಡಿಸ್ಬೇಡಿ. Yeah, so when you have your book like this, no, okay, I'll show this side of the book. When you have the book like this, no, how to prepare partners capital account? 3 options. Option number 1, like this. Change the side of the book from vertical to horizontal and then write it. You can write. Second method, do like this only. Here you write debit side, here you write credit side. Hello. Third method of presenting. Write debit side here on the top, write credit side below the debit side. Allowed. But write the heading debit, write the heading credit without fail. All the 3 methods are allowed. Only one point. Don't write in margin. Don't write in margin. Sir, how do you tell this is possible? Did you correct paper ever? No. Based on the ICAI standards, people in teaching cannot correct paper. Not just me, no one in teaching has corrected paper. If anybody tells, take it from me that they are lying. Okay. If I tell someday that nanu paper correction madidini, I am lying. Okay, now do I know? Simple. I've taught so many students. After writing, if they fail, if they pass, I ask them to apply for photocopy. They apply for photocopy. I've seen it. People who have written debit here, credit here have got marks because the ledger is correct. If they've written debit above, credit below, they have also got marks. If they've changed the alignment like this, they have also got marks. I say I will give marks. Sir, which one to write? Your choice. Write however you want, but decide now. Don't be like I'll decide in the exam. Decide now how you want to write and then write. The best is writing both everything in one place. If you can't do that, then you split it and then write. Whatever is most comfortable to you. Are you getting it? There is nothing that this is better than that, that is better than this. This is not Rajvardhan sir's suggestion. This is what you students have done in the past in the exam for which they have given marks. Once one student told, sir, I'll write debit and credit in the same page above and below. Will I get marks? I told you write. How will I know? You write, you get marks or not, we'll apply for photocopy, we'll get to know. He did. We experimented, social experiment, it worked, marks were given. So I'm telling you based on his experience. If you also have some experiment, you tell me, we will do it. So many students are there. Test ಮಾಡ್ಬೋದು. Okay, in my partner's capital account, on the credit side, I will write by balance brought down. How much? 3,55,000, 2,20,000 and 1,25,000. Got this? Say something. Very good. What's after this? General reserve. General reserve should be shared to partners. In what ratio? Profit sharing ratio. How much general reserve? 1,50,000. I'll write here by general reserve. 1,50,000 should be shared in the ratio 3:2:1. 3/6, 2/6, 1/6. 75,000, 50,000, 25,000. 75, 50, 25. I hope you guys understood this. What do we have after general reserve? Employee provident fund. Employees who have worked really hard, when they retire, if you give them money, you created a liability 60. All the liabilities will be closed by transfer to realization. Liability will usually have credit balance. When you close it, you have to debit it. Journal entry will be employee provident fund account debit to realization. In realization account, I'll write by employee provident fund 60,000. Done. What's after that? Trade creditors. This is not some special liability. This is also normal liability. Closed by transfer to realization account. Journal entry. Trade creditor account debit to realization. In realization, I'll write by trade creditors. Amount 1,24,000. Done. By this, we're done with liability side. Come to asset side. Land and building 4,85,000. Machinery 1,88,000. Okay. Furniture 1,05,000. Stock 55,800. Trade debtors 1,56,000. All of this have debit balances. To close them, I should credit them and debit realization. Entry is realization account debit to land, realization account debit to machinery, realization account debit to furniture, realization account debit to stock, realization account debit to trade debtors. I would write it all here. Realization account debit to land and building, realization account debit to machinery, realization account debit to furniture, realization account debit to stock, realization account debit to trade debtors. You understand? After this, we have cash and bank. We'll open one cute, sweet, separate cash and bank ledger and write there 44,200 as balance brought down. This, my friends, is cash and bank account. On the debit side, I'll write balance brought down 44,200. By this, I'm done with entire balance sheet closing. Now we'll go to adjustments. What is there in the adjustment? First one, there was an unrecorded investment which was sold for 30. They made some investment, they have sold it, they've got 30, but that investment was not written in the balance sheet as an asset. Unrecorded asset. When it is sold, you receive money, cash account debit. Because it is an unrecorded asset sold, it is profit, credit realization account. Remember this statement. If you want, you can put a tattoo of this statement on your hand. In the process of realization, that is dissolution, any profit or any loss has to be transferred to realization account. Any expense, any income, any profit, any loss arising in the process of dissolution should be routed through realization account. Don't write it to P&L. Why? P&L is already closed by transfer to capital. Business is closing down. Why do you open P&L now? Understood? Write it to which account? What is the journal entry for sale of that asset? Cash account debit to realization. In cash account, I'll write to realization. Unrecorded investment. How much? 30,000. In realization account, I'll write credit side. Buy sale of asset. What asset did I sell? Investment. How much? 30,000. I can write everything together once for all. I can write it individually also. I will write all the assets here, line, total them and write them for once. Or if you want, you can write it individually also. Do you want me to write it individually? Pakka, we'll write the total. Next, what do we have after that? After that, one of the creditors agreed to take over some items of furniture of book value 25,000 at 24,000. What did one creditor do? He took over one furniture. Firstly, creditor's ledger is already closed by transfer to realization. Nextly, furniture is also closed by transfer to realization. If one creditor who's there in the realization box takes one furniture which is there in the realization box, journal entry will be realization account debit to realization. Now, 25,000 worth of furniture is taken for 24,000. 1,000 profit or loss, that will also be debited or credited to realization only. So, entry is realization account debit to realization. Don't write such entry, ignore. If one existing liability takes over another asset, there is no journal entry for it in realization process. Within the box, within them, it will get adjusted. But for the balance, we'll write the entry. Rest of the creditors were paid at discount of 5%. For this rest of the creditors paid, there is entry. How much is creditors value? 1,24,000. Out of that, how much is settled by issue of furniture? 24. From 1,24,000 deduct 24. 1 lakh is to be paid at discount of 5%. So 1 lakh minus 5%. 95,000 is what we pay. Should write journal entry for 95. What is the entry when you pay 95? 95 cash is going out. Debit will be usually creditors. Creditors account debit to cash. Discount also. Creditors account debit to cash to discount. First of all, you can't debit creditors. It will be replaced with realization. Next, you can't credit discount income. That will also be replaced with realization. Basically, entry is realization account debit to cash, 95,000 paid. Realization account debit to cash, 95,000 paid. So in my cash account, I'll write debit side. What is it? Credit side. I'll write by realization creditors. How much did I pay? 1,24,000 by furniture. In the balance, I took 5% discount and I paid 95. In cash, I'm writing by realization. Once I write everything here, no, all of them together, I'll write in realization account on the debit side. One net amount. Is it okay? If you want, I can write individually also. Is this fine? Then, out of trade debtors, 9,000 proved bad. Remaining were fully realized. How much is trade debtors? 1,56,000. How much of it became bad? 9. 1,56,000 minus 9. 1,45,000 will be received in cash. What is the entry when you receive 1,45,000? Cash account debit to trade receivables. Don't write journal entry for bad debts. Why? If you write entry for bad debts, you write cash account debit 1,56,000, bad debt account debit 9,000 to trade debtors. Bad debt is an expense. It will be replaced with realization. Trade debtors already closed by transfer to realization. There also will write realization. So instead write entry only for the amount received. Cash account debit to trade debtors. 165 minus 9. 156. Am I right? Sorry, whatever. 140. Sorry. So in my cash account, I'll write trade debtors. How much? 156 minus 9, 147. Total amount will be written in realization account credit side. Don't worry right now. What's after that? Then we have other assets. Land and building, machinery, furniture, stock. Land and building, 5,25,000. Entry, cash account debit to land and building. Machinery, cash account debit to machinery. In cash account, I'll write land and building, machinery. How much? 525 and 170. Done. Total amount I'll write in realization. If you want, you can write individually also. Then I have furniture. Remaining is taken over by P at 75,000. Partner P is taking over furniture. Furniture is going out. Credit furniture. Partner P's capital will decrease. Debit partner P. Journal entry will be partner P's capital account debit to furniture. Partner P capital account debit okay. Furniture account credit not okay. It will be replaced with realization. Entry will be partner P account debit to realization. So I'll write in my partner P's account to realization. How much? 75. Correct? Huh? Yes or no? In realization, I'll write credit side. What do I write? P's capital account. Furniture taken over. 75,000. Done? Then stock is sold at 60,000. Entry is cash account debit to realization. We were writing no in cash account. List of items. Continue. Right? Stock. Furniture was taken over by P. Stock, I'll write 60. I hope you all got this. What's after this? Anything more? Expenses on dissolution 18,700. When you pay 18,700 expense, what is the entry? Expense to cash. But I told you all expense will be replaced with realization. Entry will be realization account debit to cash. In realization account, I'll write debit to cash. In cash account, I'll write by realization. How much? 18,700. In cash account, I wrote by realization. In realization account, I'll write to cash, to cash, to cash. Expenses on dissolution. 18,700. Done. What's after this? There was an outstanding bill for repairs. Some bill they have not paid. How much is it? 3,000. What is the entry when you pay some expense? Expense account debit to bank or cash. But expense will be replaced with realization. In realization account, you would have to write to cash or bank, settlement of liability. What did you pay? Sorry, we'll write the total amount together. Here I would write below creditors, unrecorded outstanding repair expenditure paid 3,500. Got this? Total I'll write there at once. Is it okay? Then everything's done. One last check to do before we close the problem. Check if all the assets have been sold. Check if all the liabilities have been realized. Land and building sold? Yes. Machinery? Yeah. Land and building sold. Correct? No. Land and building sold. Machinery sold. Furniture taken over. Stock sold. Then trade debtors received. No, already trade debtors. We only told trade debtors, some amount was received, some bad debts was there, done. So all assets done. Liabilities, employee provident fund, we have not paid. We have not paid. So what do? They have not mentioned outright. We will assume that it is settled at book value. Any asset which is not sold will be assumed to realize zero. Any liability not settled will be assumed to be settled at book value. Conservative approach. If they don't tell anything, asset realizes zero. If they don't tell anything, liability has to be settled at book value. So in second PU, that is second PU. There you did not apply conservative approach. How many of you used to assume asset sold at book value in second PUC? Completely incorrect. Against conservatism. There you don't change the answer. There you write that. Here you write this. Okay? Don't argue in the school now. College ala. Don't argue in the college. Madam, nimgenu gottilla nange ella gottu. Don't tell that. Okay? Adu alli ade correct. This employee provident fund I'll pay 60,000. So in my cash account, I'll write credit side. Employee provident fund paid 60. Done? Come on, let's close the ledger now. So tell me this total cash balance paid, received, how much? 30 plus 1,47,000 plus 5,25,000 plus 1,70,000 plus 60. In cash and bank, I've written 2 realization. In realization I'll write by cash and bank. How much total? 9 lakh, 9 lakh 76,000. 9 lakh 76,200. If you're getting different number, maybe you're a little high. Yeah, sale of assets 9 lakh 32,000 बढ़ता है. Isn't this the amounts? 3 lakh 30,000. 9 lakh 30,000, 147, 525, 170 and 60. What did you do? You added 44,200 also. Shabash. You should take only these two. 30, 147, 525, 170, 60. 9 lakh. What were you doing then? You added 44,200 also. Okay. Liabilities. How much did we pay? 95, 33,500 and 60,000. Only items that I selected. 3 of them. 1,58,500 is on the payment. Entry is realization to cash. Am I right? In cash account, I written by realization. In realization account, I'll write to cash. Settlement of liabilities. 1,58,500. Done. Everything's closed. Yeah. Realization, partners capital, cash and bank. Cash and bank already closed. Close your realization, find profit or loss, share it in profit sharing ratio, transfer it to partners capital, see partners capital account, tally. In that you will find cash as balancing figure. You put that to cash, cash will close. Cash is not yet closed. Find the balancing figure here. How much is realization, profit or loss? Credit side total 11 lakh 91,000. Identify the balancing figure. 24,000, share it between P, Q, R in the ratio 3:2:4. You will get 12,000, 8,000, 4,000. In realization, you written two partners capital. In partners capital, you will write by realization 12, 8, 4. Done. Identify balancing figure, that will be cash. Total the cash, put it to cash account, and cash account you might just see tally. Check 355 plus 75 plus 12. 360, 420, 452, sorry, 442, 442 minus 75,000. Use your calculator. I'm not hearing any noise of calculator. 3,67,000. This is the cash paid to partner P by the firm. So much cash should be there. Let's see Q and R also. What will happen? 220 plus 50 plus 8, 2,78,000. From 2,78,000 we deduct 0. So 2,78,000 will be paid to partner Q. To cash and bank. Partner R 154. 150. 154 will be paid to partner R. In partners capital, I've written 2 cash and bank. 367, 278, 154. In cash and bank, I'll write by partners capital. P 367, Q 278, R 154. Total 7,99,000. Check whether the total will match in the cash book. Cash book has to be closed by this. If it does, then it means we have done right. If not, something's wrong. $976. That's the end of dissolution question from partnership in June 24 examination of CA Foundation Accounting. By this we're done with 3B. 3B. Yay! So 3 questions done of 20 marks each. 60 marks damar. And we've taken how much? We've taken not even 1.5 hours. With explanation. Let's go to the next one. What's the next one? Next one, 4. Fourth one. Again, partnership question. Can we do question number 4 from partnership? Anu and Manu are carrying on business in partnership and sharing profits and losses in the ratio 5:3. The firm's balance sheet as on 31st of March 2024 is given below. Don't waste time reading the balance sheet. Quickly come to what's given after balance sheet. They decided to admit Ranu as a partner with effect from 1st April 2024 on the following terms. What are the terms that they're following? Ranu will be paid 1/5 share in the future profits and new profit sharing ratio will be 5:3:2. Okay, there's an admission of a partner. Ranu will bring 1 lakh as capital. Goodwill data is available. It also agreed that partners will not withdraw their share of goodwill, nor will goodwill appear in the books of accounts. Goodwill should be adjusted without opening goodwill account. Goodwill should be adjusted without opening. I'll teach you how to do. Very easy. It was decided that the value of the assets will be like this. Building is to be appreciated by 50. So building, there is an adjustment. Then there is adjustment on machinery, furniture, investment, inventory. Debtors also. Building, there is adjustment. Then there is adjustment in machinery. Then there is adjustment in furniture. Then inventory. Trade receivables, there is doubtful debts. Investments also, they've given some value. Cash will anyways change. Cash will anyways change because that partner will bring in cash towards capital and all that. And capital will change. Then what else is there after that? That's it. You are required to prepare revaluation account, partners capital account and balance sheet of the reconstituted firm as on 1st of April 2024. Can I begin? We'll keep revaluation account in first page. We'll keep cash and bank account because it's needed. Partners capital account in the second page. You have the choice to open it in two different pages and write, followed by balance sheet on the third page. Whatever is your goodwill adjustment and all will be written in page number 4. Computation as well as adjustment. Can we proceed? Very nice. Come on, have a look. What's happening? To begin with, we have capital. How much is the capital? Anu 2,80,000. Manu 2,50,000. 2,80,000 and 2,50,000. I'll write in partners capital account on the credit side as by balance brought out. Can you close the door? In my partners capital account, I would write by balance brought down Anu 2,80,000 and Manu 2,50,000. I hope everybody got this. What's after that? Long-term loan. Is there any adjustment? No adjustment, nothing. Straight away you can put this in the balance sheet. They've not repaid any part of the loan, nor have they revalued anything, nothing. You will prepare balance sheet now after reconstitution. In this balance sheet, you can straight away write capitals. After capitals, you can write long-term loan 2 lakh as it is. There's going to be no change in capital of 2 lakh. Sorry, long-term loan of 2 lakh. What is after that? Trade payables 1,19,500. There's no change. Have they given any adjustment? As it is, you write trade payables 1,19,500 in the balance sheet. I'll repeat, first page revaluation, second page partners capital, second and third page or second page up and down. Third page you can write balance sheet, fourth page goodwill adjustment. After trade payables, outstanding liabilities 16,200. As it is, you write the 16,200 in your balance sheet. What do we have after that? Come to asset side. Building 3,80,000. Inner column. Why? There is adjustment. Inner column 3,80,000. Then machinery 1,43,000. Adjustment inner column. Leave 2 line space below building. Why? Building vidogata. No, revaluation you should do, no. 1,43,000 machinery. Then you have furniture 85. Leave 2 line space and write furniture 85,000. You'll do revaluation later. Okay. Then trade receivables 1,64,000. This also has revaluation. Right? Trade receivables 1,64,000 in the inner column. What's after that? Inventory 48,400. This also inner column. Investments 15,200 also inner column. Yalla inner column. Inner feelings. Yeah, inventory is 48,400. Investments 15,200. What's after that? Cash we have 30,100. This I'll open one ledger. Why? There is cash that the new partner will bring. We might pay some expenses. Some transactions might be there. I'm not telling you will. Might. If it is only one item, like cash brought in, I will write it in the inner column here only, add and close. But anyways, we will open a ledger to ensure that we are safe. I'll write here balance brought down 30,100. Are you guys getting it? What's after this? By this we're done with balance sheet. Come to the later part. They admit Ramu as a partner with effect from 1st of April on following terms. He'll be paid how much share? 1/5. Remember, you'll get 1/5 share in the profits in the future. Profit sharing ratio for the future will be 5:3:2. Later, not now, not now. Ranu will bring 1 lakh as his capital. Journal entry, when you bring capital. Cash account debit to capital. In partner's capital account, right, by cash. How much did you bring? 1 lakh. And in my cash account, I'll write debit side to Ranu's capital, 1 lakh. Are you guys getting it? What's after that? Goodwill of the firm is valued at 2 years purchase of average profit of last 3 years. What is goodwill? It is probability that the existing customer will stick to same business. Ranu is joining the firm where there is already hard-earned effort of Anu and Manu. Because Anu and Manu have put in effort, with no effort in the future, they'll still earn profit. People will come and buy goods from Anu and Manu because of their past effort. Which if Ranu joins, he'll also enjoy in the future. So Ranu has to buy it. Ranu is asking Anu and Manu, for how many years do you think people will come back and buy the goods from your own shop? They'll say, whoever comes and then purchases goods from us once, for next 2 years, they'll come to us. If for the next 2 years, customers will come and buy from firm, it is because of their past efforts. Next 2 years profit, whatever will be earned by the business, is because of Anu and Manu, not because of Ranu. So, whatever profit Anu and Manu will receive later, whatever profit Ranu will receive next year and the year after that, it is not belonging to Ranu. It's actually Anu and Manu's effort. It is actually Anu and Manu's effort, but Ranu will receive. So, Ranu has to give that profit portion back to Anu and Manu. So, goodwill is purchased by Ranu from Anu and Manu because in next 2 years, whatever profit will be made by the firm, it is because of whose effort? Anu and Manu. But Ranu became partner today. Next year, when you share the profit, you will give it to Ranu. Am I right? Next to next year, when you earn the profit, you give it to Ranu. But Ranu doesn't deserve it. So Ranu has to give it now only. Later, he will get it. So basically, it's not his profit. Are you getting it? Because of Ranu's efforts, profit will be earned by the firm after 3 years. For the next 2 years after admission, whatever profit is earned by the firm is because of Anu and Manu. But how do we know how much profit will the firm make in the next 2 years? Expectation, average. What is the profits that they made in the last 3 years? 87, 1 lakh 6 and 1 lakh 22. I'll add all the 3 divided by 3. On an average, 1 lakh 5,000 is made per year. For the next 2 years, how much profit will they make? 2 lakh 10. That is the reason we take average and multiply with number of years purchase. It's not some rubbish formula. I'll repeat once again. I want you to understand the logic. If not, you will suffer later in the journey. Ranu is joining the firm today. Next year and the year after that, for the next 2 years, profits that the firm will make is because of the sales made by the firm. Is because of hard work of Anu and Manu. Ranu just joined. He will have no contribution into the business. So next 2 years, whatever profit firm will earn, will Ranu get a share in that or not? He will get. Why? Because he became partner now. At the end of this year, at the end of next year, profit and he will get share. But does he have contribution towards it? No, it's because of his other partners' efforts. So Anu and Manu are like, no, what profit we earn this year and next year, it's ours, it's not yours. But by partnership deed, you should give him share. So what do we do? On admission only, we'll collect extra money from him. The expected profit that the firm will earn in year 1 and year 2 will be added. And then whatever Ranu will receive will be taken from him now only. So that now we will take, later he will get. It will become same. It's like Kottangu agate, goodwill is Kottangu agate. That is the reason it's called goodwill. And this goodwill, they say in the question, don't show in balance sheet. It should not be shown in the books of accounts because it is not fair to do that. He became partner today. Next year profit should be given to him, no? But we collect from him in advance. This is the reason it's not called as intangible asset. When I give you example for intangible asset, I told you no home, patent, trademark, copyright license. I told you don't tell goodwill, it's ugly. This is the reason. Are you getting it? It's a private settlement. You should learn how to settle it, but don't read it in the balance sheet as an asset. Little did you understand? Fantastic. Come on, help me with this now. What is the year ending and then profits? Yeah, 31st March 22, 31st March 23, 31st March 24. 87, 1 lakh 6, 1 lakh 22. Can I say 3 lakh 15 total profit? Divided by 3 years. 1 lakh 5 per year. How many years is Anu and Manu expecting? What do you mean by number of years purchase? Number of years for which they expect the customers to come back and then buy the goods from them only. Because of which the firm will make profit without Ranu's contribution. Logic, logic, logic. What is goodwill? It is name, sir. It is fame. It is extra profit earning capacity. Partner ಬಂದು ಕಿವಿಲಿ ಹೇಳ್ಬಿಟ್ಟು ಹೋಗಿದ್ರ ನಿಮ್ಗೆ? It is not extra profit earning capacity. It is effort already put in by the old partners, because of which the results will come in the future, which only continuing partners, old partners should get. But new partner is taking it as a share. So you should compensate it by giving it to old partners. Please do 1,05,000 into 2. 2,10,000 is goodwill. Now, this 2,10,000 belongs to whom? Old partners. This profit belongs to whom? Old partners. Share it in old profit sharing ratio 5/8, 3/8. Old ratio is 5 to 3. 1,31,250 and 78,750. You should give it to old partners. No. Am I right? Why? It actually belongs to them. But you know what do we do? Next year, we give it to all three of them. Next year, when we actually earn profit, it will be credited to all three of them. Reverse it by debiting all the continuing partners, or reverse it by debiting all the partners in new profit sharing ratio. What is the total amount of goodwill? 2,10,000. 2,10,000 should be now debited to all the partners. Anu, Manu and Ranu. How much? What is the ratio? 5 is to 3 is to, where is it? Where is it? Where is it? Here. 5/10, 3/10, 2/10. 1,05,000, 63 and 42. You get this? In end of year 1 and the end of year 2, together they will earn 2,10,000 profit. For 1 year, 1,05,000. Ranu is a partner. For what share? 2/10. Ranu will receive 42,000 later. Ranu will receive 42,000, but that 42,000 is because of Anu and Manu's effort. So what should Ranu do? Now only he should give it to Anu and Manu, so that he will receive later. Are you getting it? How much? 42. Ranu's capital will decrease. Debit is capital account by 42. Credit to Anu and Manu in their PSR. Now we need to write two entries. Instead, take the net effect. Take the net effect. So tell me, credit 131,250, debit 1,05,000. What do we get? Which is more? Credit, no. Do 131,250 minus 1,05,000. 26,000 to 50. Credit. Am I right? How about Manu? 78,750, 63,000. Credit is more by how much? 15,000. And Ranu should give 42,000. Whatever 42,000 Ranu will give will be taken by Anu and Manu in 26,250 and 15,750 ratio. Yeah, same thing in your PU. What do? You identify sacrifice ratio of Anu, sacrifice ratio of Manu, and 42,000 contribution made by Ranu into the firm will be shared between the sacrificing partners in sacrifice ratio. I'll tell you, fractions are complicated to deduct. You need to take LCM and everything. Correct. So don't deduct old ratio and new ratio. Old ratio you apply on goodwill, right? New ratio you apply on goodwill, right? Take difference of amounts, easy. Instead of doing old ratio minus new ratio, which is irritating because fractions, no, denominator will be different. You need to do least common multiple and then do simple. Old ratio and new ratio, when you deduct, sacrifice ratio will be applied on goodwill only, no? So instead, old ratio multiplied by goodwill, new ratio multiplied by goodwill, goodwill amounts you deduct, you'll get the same thing. You will save so much of time and effort. Sir, will this work in all cases? All cases. Sir, goodwill raised, written off? Yes. Goodwill raised partly, written off? Yes. Goodwill adjusted through partner's capital account? Yes. Goodwill adjusted secretly? Yes. Goodwill not to be shown in books of accounts? Yes. Hidden goodwill? Yes. All cases, just this one table. Try today. If in case you get stuck, get back. Ask me. Do drop a message in the comments also. People who are watching it record it later. If in case, if this likes, then you tell goodwill and then put one heart in the comment if you understood this or if you love it. Yeah. Yeah, you guys also later you can put a comment. Now help me with the journal entry. First bari really comment ಗೆ ಹೊಟ್ಟೋಗ್ಬಿಟ್ರು. ಯಾ ರೀಲ್ಸ್ ನೋಡ್ತಾ ಇರ್ತಾರೆ, ಕಮೆಂಟ್ ತೆಗೆದು ಕಮೆಂಟ್ ಓದ್ಕೊಂಡು ಕೂತ್ಕೊಂಡ್ಬಿಡ್ತಾರೆ. ಕಮೆಂಟ್ ಓದಲು ಬಂದವರೆಲ್ಲರಿಗೂ ಊಟದ ವ್ಯವಸ್ಥೆ ಮಾಡಲಾಗಿದೆ. ಯಾ 42,000 Ranu debit. Credit Anu 26,250. Manu 15,750. This is goodwill adjustment journal entry. So shall I credit Anu and Manu by 26,250 and 15,750? Into partners capital account. I'll write Ranu account and credit Anu and Manu by 26 to 15 and 15 7. This is goodwill adjustment. And Ranu has to be debited. No, I should take money. How much? 26 to 52 Anu, 15 750 to Manu. Together, Ranu account is debited by that same 45,000. 42,000. 42,000. Yes. What's after that? Then we're done with this entire third adjustment. Fourth one. It was also agreed that partners will not withdraw their share of goodwill nor the goodwill appear in books of accounts. We already settled. Over. Fourth adjustment. Fifth, it was decided to revalue the assets. This is your favorite and easy one. Building is to be appreciated by 50. Building, I should add 50. In balance sheet, I will add 50, making it 4 lakhs. Income, no. Entry is building account debit to revaluation. In revaluation account, I'll write by building. What will I write? By building. How much? 50,000. Done. What's after that? Machinery is to be depreciated by 10%. Come to machinery. 1,43,000. Revaluation, how much do we deduct? 10%. 14,300. Deduct, what do we get? Machinery has to be reduced. Machinery account credit. Debit will be revaluation. Journal entry. Revaluation account debit to machinery. In revaluation account, I'll write debit side machinery 1,28,700. To machinery 14,300. Sorry. 14,300. Only that decrease part. Furniture is to be revalued at 80,000. Come on, furniture is how much? Should record 80. It is right now 85. How much is the revaluation minus? 5,000. Entry will be revaluation account debit to furniture. How much? 5,000. In revaluation account, I'll write to furniture. How much? 5,000. Done. What do you have after that? Investments is to be valued at 16,000. Come on here. Investment is how much? So if 15,200. If I make it 16, I'm increasing by 800. Income. Entry is investment account debit to revaluation. In revaluation account, I'll write by investment. How much? 800. Got this? What's after that? Inventories is to be recorded at 47,500. Come to balance sheet. Inventory is 47,500. From 48,400, if it is reducing to 47,500, can I say it's reducing by 900? Less revaluation 900. Inventory account credit, revaluation account debit. Entry is revaluation to inventory 900. In revaluation account, I'll write to inventory 900. Done. What's after that? Provision for doubtful debts created at 5%. Last adjustment. Come to debtors, create provision, deduct 5%, which is 8,200. What do we get? 1,55,000. Provision is a liability. When you create it, it should be credited. Debit will be P&L. Usually provision create entry is P&L to provision, but any expense, any income, any profit, any loss arising in the process of revaluation, that is admission, retirement or death, should be routed through revaluation account. Entry will be revaluation account debit to provision. In short, expense should be debited in revaluation. 8,200. You like that logic, no? Yeah, I know. Journal entry la yavanig beku. Yeah, 8,200. You understand? Then that's it. You are required to prepare revaluation. Almost ಆಯ್ತು. Partners capital account. Full ಆಗೋಯ್ತು. Balance sheet total ಒಂದು ಮಾಡಬೇಕು. Ready? Ready to yes 12 marks? Yeah, come on. Let's close. Revaluation account. 50,800 minus 14,300 minus 5 minus 900 minus 8,200. 22,400. Share it between Anu, Manu and Ranu. In what ratio? 5:3:2. 5/10, 3/10, 2/10. Sorry, only Anu and Manu. This is admission problem, no? I was thinking retirement. 5/8, 3/8. Anu and Manu. 14,000 and in revaluation account, I've written two partners capital. In partners capital account, I'll write by revaluation. How much to Anu, how much to Manu? 14,000 and 8,400. Revaluation account is closed. Don't close your cash account. First close your partner's capital. Is there capital adjustment? No. Then we can close our cash account. It will be balance carried out, which will go to balance sheet directly. How much? 1,30,100. Actually, there was no need of ledger. You could have written directly in balance sheet plus 1 lakh capital. We thought there are more adjustments. I'll write in my balance sheet cash 1,30,100. Balance sheet is raring to total and tally, but we'll close our partner's capital first. Total Anu's column 2,80,000 plus 26,250 plus 14,000. 3,20,250. That will be balance carried out in Anu column. Manu 250 plus 15,750 plus 8,400. 274 150 is the balance carried down because there is no debit items. Ranu, he bought 1 lakh capital. Papa, you ribru serkomuttu Goodwill anta appears mabutru. How much? 48,000. 58 minus that 42, sorry, 58,000 is remaining. 42,000. I was telling 42 correctly. Cash andre in this only it's included. No, yeah. We brought in separately in cash at the Kotora. Here have they given. It was also agreed that partner will not withdraw his share nor will goodwill appear in books of accounts. Profit will bring his share of goodwill in cash. It's assumed that it is part of capital. If not, you can write separately here by cash. Let's check once. Have they written cash separately? 1 lakh ashte. Hey, come on, yeah. 1 lakh includes goodwill. 1 lakh includes goodwill. He brings in cash within goodwill, within capital only. Already included. Don't have to write it separately. 58,000 is his closing capital. Understood? So 320, 250, 274, 150 and 58,000 is the capital balances. Anu, Manu and Ranu. 320, 250, 274, 150, 58. Add everything together. 6,52,400. Now take the total on the liability side. 652,400 plus 2 lakh plus 1,19,500 plus 16,200. Together will come to 9,88,100. Similarly, take the total on the asset side. 4,30,000 plus 1,28,700 plus 80,000 plus 1,55,800 plus 47,500 plus 16,000 plus 1,30,100. 9,88,000. Sorry, nothing. Just celebrating Virat Kohli's time. You got it? By this, we close the balance sheet of partnership firm in the case of admission. Let's now solve question 4b. Yeah, June 2024 paper. Incomplete records. Have a look at this question. Harshit Traders are carrying on retail business of electrical goods. They kept their books under single entry system. The balance sheet is given. Whenever the entrepreneur maintains the books of accounts under incomplete records or single entry system, and we were supposed to identify their profit and the position, we have two options. We can either do statement of affairs method or we can alternatively do conversion of single entry to double entry. We can either do statement of affairs method or conversion of single entry to double entry. Let's see what's happening in this specific question. They have given cash book data also, GP ratio, something or not. Then prepare trading P&L and balance sheet. So this is conversion of single entry to double entry. I'll write trading and profit and loss account in the first page of my notebook. Next page will be balance sheet. And the third page onwards, I'll keep it open for all the working notes that is needed. Can we begin? See the first item that's given here. Capital 6,05,000. This capital will appear in my closing balance sheet. This is trading P&L. Next page I'll write balance sheet. In the inner column, I would write capital 6,05,000. To this capital, I should add profit and then post it to outer column in the balance sheet. But I have not yet determined the profit, so I will not add profit. I'll just write capital in the inner column and wait. Come to next item. Trade creditors. How much is my trade creditors? 75,200. This 75,200 being trade creditors, opening balance, I'll open one ledger called trade creditors. On the credit side, I'll write by balance brought down 75,200. What's after that? Salary payable 9,000. In my salary account, I'll write on the credit side by balance brought down 9,000. What's after salary? Liability side is done. I'll go to asset side. Motor vehicle 1 lakh 10. Motor vehicle 1 lakh 10 is opening balance. Closing might not be 1 lakh 10. There might be some depreciation, some adjustment. So I can write in the balance sheet asset side, but keep it in the inner column. If there is depreciation, I'll deduct it and then write in the outer column. If there is no depreciation, directly I'll write 1 lakh 10,000 in the outer column. I hope you all got it. What's after motor vehicle? Furniture. How much is furniture? 73,500. Again, there might be depreciation. I'll keep 73,000 furniture in the inner column. Later, once I deduct the depreciation, I'll post it to outer column. Don't just watch this video like this. I would want you to grab a pen, book, and calculator and write with me. Practice this. Try and write. You will get to know how good are you. But if it's not good, you will get to know that you're good. If you're not good, you can take some corrective action rather than living in illusion. If you can get it right, you will feel more confident. Yeah, I got it right. I'll pass the exam. Stock in trade 1,78,800. This is opening stock. Opening stock will be written in the trading account. On the debit side, I'll write opening stock 1,70,800. I hope everybody understood. What do you have after this? We have trade debtors 1,45,400. This trade debtors of 1,45,400 is the opening trade debtors, not the closing trade debtors. To this, I'll add current year credit sales. Then I will deduct the cash collected from these debtors, bad debts. Then I'll find the closing balance. In this balance sheet, what we have to write is closing balance. So don't write the trade debtors. Open trade debtors ledger, write balance brought down 1,45,400 rupees. Then we have with the 6% investment 60,000. This is an asset. Unless they tell that it is sold, it will be there at the same value in the balance sheet. Do we have anywhere in the receipts and payment side sold? Sold means we would have received money. Do you have anywhere investment? No. Investment was 60,000. Investment will remain 60,000. Balance sheet asset side, I would write investment 60,000. And another point to note, they've given investment 60,000, interest rate 6%. Assuming 60,000 to be nominal value, on 60,000 you apply 6%. 3,600 will become interest income. Interest income of 3,600 should have been given somewhere there as income. Later, let's see. Let's see that later. 3,600 is given, but anyways, not so hurry now. We will see it later and then we'll correct. Is it okay? Is the income matching with receipt? Yes. I told this to you in NPO revision. I told this to you in final accounts revision. I told this to you in incomplete records revision also. Income 3,600. Receipt 3,600. Both match. There will be no asset, no liability. What if income is 3,600, receipt is 3,500? 100 rupees will be interest accrued but not received. But we don't have that adjustment in this case. I hope you got it. Very good. Then what's after that? Cash in hand and at bank 1,29,500 is the opening balance. Don't open cash account. Why? They've only given cash account. If they had not given this receipts and payment cash account, then I was supposed to open. 129,500 will come here only. Done. Don't be worried. Don't open Cashbook. If you open, you'll write the same things that is there here once again. You won't get any marks for writing the question again in the answer. Yeah? How many of you had this idea? Hey, ಏನು ಗೊತ್ತಿಲ್ಲ ಅಂದ್ರೆ ಟೆನ್ಷನ್ ಮಾಡ್ಕೊಂಬೇಡ. Whatever is there in the question paper, write same thing in the answer paper. At least they'll give 1 mark. This is not that exam pro. Cash sales 10,22,400. This is goods sold for cash. When the goods are sold for cash, cash will be received. Cash received is come in cash book debit side, receipt. It will be written in trading account credit side. Come to trading account. This is my trading page number 1. I'll write credit side by sales. We'll have 2 cash sales, credit sales. Now I know credit sales. Credit sales, no? Sorry, cash sales 10,22,400. Sir, how do we get to know credit sales? Very simple. Debtors ledger. If they give opening, closing, and cash collected from debtors, balancing figure will be credit sales. Sometimes they won't do that. Sometimes they will give GP amount. Using GP amount, I'll find total sales as balancing figure. Using total sales, by deducting cash sales, I'll find credit sales. I'll write credit sales in debtors account, and sometimes they would have not given closing debtors. I would find that as balancing figure. So right now it's too early for us to decide. We don't know. Whatever we know, we will write. Whatever we don't know, we can't write. Then receipt from trade debtors. They've told how much money is collected from debtors. How much is collected? 85,52,000. What is a journal entry when you collect money from debtors? Cash account debit to debtors. Cash account debit to in my trade debtors account. I would write by cash 85 lakh 52,000. I'm not preparing cash account. It's already prepared. They've given opening, they've given cash collected. We don't know credit sales, we don't know closing balance. If they give closing balance of debtors, we'll find credit sales as balance and figure. If they give credit sales, I'll find closing debtors as balance and figure. One of them they'll give, the other they will not. Is it okay? Then we have interest on investments. 3,600 is received, 3,600 is income. Income I'll write directly in my P&L account. Below trading account, in P&L I'll give little space to write gross profit, and then I'll write interest income on investments 3,600. I hope everybody understood. Then we'll write cash purchase. How much is cash purchase? 9,48,400. Where do I write this? In my trading account, on the debit side, I'll write purchases. Purchase will be cash and credit. Now I know cash purchase 9,48,400. Later, when I get to know credit purchase, I'll write credit purchase also. Where do we get credit purchase from? From creditors account. Wait till you close it. Then payment to trade creditors. How much did you pay to trade creditors? 75 lakh 45,000. What is the entry when you pay? Trade creditors account debit to cash. Let's go to trade creditors account. I'll write here to cash and bank. How much? 75 lakh 45,000. I hope everybody understood this. What's after that? Salaries 4 lakh 12,800. Salaries is an expense. I'll write in my profit and loss account debit side. Wait, was there any opening outstanding salary? Did you open ledger? No. Yes? Oh, have we? Oh, salary. And the salary is paid. Entry is salary account debit to cash. How much? 4 lakh 12,800 rupees. Done. What's after this salary? We have rents and taxes. How much is rents and taxes? 2,51,600. Journal entry is rent and tax account debit to cash. Do we have rent and tax ledger? No. No adjustment. I'll write rent and tax as expense paid directly in my P&L. Rent and tax. Rent and tax. 2,51,600. Am I right? Then we have Sundri expenses. 1,38,400. No adjustment, nothing. Directly write Sundri expenses in your P&L account debit side. 1,38,400. Then drawings of 2,40,000 is the amount withdrawn. This will reduce our capital. In the closing balance sheet, I have written capital in inner column. I'll write less drawings, 2,40,000. I hope everybody understood reduction of drawings from capital. Then we're done with this. What do we have after this? One last item in the cash account. Closing balance of cash. How much? 1,71,300. This is asset. In my balance sheet, on the asset side, I would write cash and bank 1,71,300. Got this? By this, I'm done with the balance sheet also. Come to the additional information. Gross profit ratio of 12.5% on sales is maintained throughout the year. How much is GP ratio? 12.5%. Come to trading account. Sales, I don't know how much. Once I identify total sales, I'll find GP as 12.5%. If I would have known credit sales, I would have known total sales. On that, I would have applied 12.5. But right now, the problem is I don't know how much is total sales. So I will wait. If I get to know GP, I'll find total sales. If I get to know total sales, I'll find GP. One of them, if I know, I'll find the other. Come to the next item. So during the year, discount allowed to debtors was 62,500. 62,500 discount allowed is expense. Entry is discount allowed account debit to trade debtors. And discount allowed being expense, in my P&L account, I would write discount allowed. I hope you understood. Says something, yeah. I'll do just one adjustment. I'll insert this here. Okay. Discount allowed is an expense. I've written here. Expenses come here. It will also decrease our debtors. In trade debtors account, credit side, I'm supposed to write by discount allowed. How much? 62,500. By this accounting done for discount allowed. Next, I have discount received. How much is discount received? 35,000. Journal entry for discount received being income. Credit discount received. Debit will be trade creditors. Can I say the journal entry is Trade creditors account debit to discount received. In trade creditors account, I'll write discount received. How much? 35,000. In trade creditors account, I have written to discount received 35,000. In my P&L account, I will write credit side discount received. How much? 35,000. This is that 6% of 60,000, 3,600. You understood this discount received income 35?
Yes, sir.
What's after that? As on 31st March 2024, closing balance of trade debtors and trade creditors is 220,500 and 1,05,600. Debtors is 2,20,500. They've given total debtors, closing debtors. If I write this, I can find credit sales. If I find credit sales, I'll find total sales. If I find total sales, I can find GP. If I find GP, I can find NP. You understood? Instead of giving total debtors, they could have given us credit sales. If they would have given credit sales, I would have found closing debtors as balancing figure. Either way is okay. You give one, I'll find other. 220,500 in my debtors account. I'll write by balance carried on. 2,20,500. 2,20,500. I hope you understood trade debtors part. This will appear in balance sheet also. Come to balance sheet. I'll write here trade debtors 2,20,500. Everybody wrote it in balance sheet also.
Yes, sir.
I hope this is not very fast. If you keep everything open, you can simultaneously post it. Tap, 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 tap. That is the smartest and fastest way to do. If you say I'll first finish full trading account, then do P&L account, then do balance sheet, might work in your 12th standard and then second PU. Will not work in CA foundation because their number of adjustments are limited. Here there is no limit. Variety is too many and size of the problem is too big. Then sundry creditors or trade creditors closing balance 1,05,600. Trade creditors account debit side 2 balance carried on 1,05,600. This being liability closing balance, I'll write this in my closing balance sheet on the liability side as trade creditors 1,05,600. I hope you understood this.
Sir.
What do we have after this? On 31st March, an amount of rupees 14,800 was outstanding towards salary. This is closing outstanding. Liability closing balance. In the balance sheet on the liability side, I'll write salary payable 14,800. Liability closing balance should be written on the debit side. In the salary account, opening balance 9,000 already written. Balance carried on 14,800, I'll write now. I hope you understood this.
Yes.
What do we have after this 14,800? Then depreciation at 10% per annum to be charged on motor vehicle and furniture. We have written motor vehicle and furniture in the inner column. They're waiting to be depreciated since a pretty long time. The moment depreciation comes, motor vehicle says, ಬನ್ನಿ ಪಾ ಬನ್ನಿ ನಿಮ್ಗೋಸ್ಕರನೇ ತುಂಬಾ ದಿನದ ಕಾಯ್ತಾ ಇದ್ದೀನಿ. But depreciation. ಯಾಕೆ ಹೊರಗಡೆ ನಿಂತ್ಕೊಬಿಟ್ಟಿದ್ದೀರಾ ಒಳಗಡೆ ಬನ್ನಿ. How much depreciation? 10%. 10% of 1,10,000. 11,000. 1,10,000 minus 10. 99. 10% depreciation on furniture. 7,350. 73,500 minus 7,350 will give you 66,150. This 11,000 and 7,350 being depreciation expenditure, it should be written to P&L account on the debit side. Shall I come to P&L account? On the debit side, we write depreciation. Motor vehicle 11,000, furniture 7,350, together 18,350. What's after that? By this, we're done with the entire question. What should we do? We should close. Don't close trading. Don't close PL. Don't close balance sheet. First, close the working notes. First, close the. You close the trading account and then get oh, your credit sales was there. That's too late. Don't do that. Trade creditors. Opening is there. Closing is there. Cash paid is there. Discount received is there. Balancing figure will be purchases. Credit purchases. Identify the total on the debit side. 76, 85, 600 minus 75,000. 76 lakh 10,400 is credit purchase. Am I right? I'll write it in my trading account on the debit side. Shall I?
Sure.
Trading account debit side 76 lakh 10,400. Here 76 lakh 10,400. Add it to find the total purchases. 85, 58, 800. Done. By this, trade creditors ledger is closed. Come to salary. Opening done, closing done, salary paid done. We'll find the salary expense as balancing figure. 4,50,000 27,600 minus 9,000, 4,18,600. This is the current year salary expense. Current year salary expense. In salary account, I written by P&L. In P&L account, I should write to salary. In P&L account, I'll write to salary. How much? 4,18,600. I hope you got it. By this, we are done with salary account. Come to trade debtors. Opening is there, closing is there, cash received is there, discount allowed is there. Balancing figure will be credit sales made during the year. Take the total on the credit side, 85, 87, 88, 35. Minus 145, 400 is 86,89,600. I'll write in the credit side in trading account as credit sales to identify total sales. Shall I? 86, 89, 600. 86, 89, 600. If I add, what do I get? 97,12,000 as my total sales. I don't know closing stock. Do I know closing stock? No. So shall I find it as balancing figure? GP baribeku first. You know GP percentage. How much? 12.5. On 97 lakh 12,000 apply 12.5%. 12 lakh 14. That 12 lakh 14 will appear here also in our statement of profit or loss. I mean to say P&L account. Is that fine? What to do now? Close your trading account and find closing stock as balancing figure. 1,78,800 plus 85,58,800 plus 12 lakh 14,000. 99 lakh 43,600. 99 lakh 43,600 minus 97 lakh 12,000. 2 lakh 31,600 is balancing figure. What is 2,31,600? Balancing figure. Closing stock. Closing stock is an asset. Balance sheet, asset side, closing stock, 2,31,600. I hope you understood. Now, total the P&L statement to find net profit. One lakh 52,600 deduct 251,600, 138,400, 62,500, 18,350, 4 lakh 18,600. How much did you get net profit? 3,63,150 rupees is your net profit. Is your net. In P&L account, you written net profit. In balance sheet, you have capital. I'll add net profit of 3,63,150. Add 6 lakh 5 minus 2 lakh 40 plus 363,150. 7 lakh 28,150 is your closing capital. Total the balance sheet and wait to see it tally. Just mentioning again, the entire chapter of incomplete records is available for all of those who would want to see. This is uploaded quite long ago. Just search incomplete records followed by my name. Virat Kohli. Sigutte. Alla, I'm not Virat Kohli. Just kidding. I am Anushka Sharma. No, just kidding. My name is Shah Rukh Khan. Sorry. Just kidding. My name? No. It's okay. I'll never take my name in my video. 8,48,550. Hey, tally, forgot to celebrate. Yes. Yes. Careful. Last time someone told yes, they got up and they left with the class like shit, Sachi. He did yes so hard that started shitting in the pants. Okay. Next one. 5A. Your favorite, most favorite valuation of inventory stock reconciliation. Oh, ಅಪರೂಪದ ಮುಳ್ಳಂದಿ ಬಾರೋ ಬಾ ನಿನ್ನೆ ಕಾಯ್ತಾ ಇದ್ದೆ ವೆರಿ ಫೇಮಸ್ ಕ್ವಶನ್ ಬನ್ನಿ Manish closed his books of accounts on 31st of March every year. Inventory taking for the year 31st of March 24 was completed only by 10th April. when they are computing inventory to be written in the balance sheet as on 31st of March 24, they should have done it on 31st March. For some reason, they could not do it on 31st March 2024. When did they do? So when you prepare the balance sheet on 31st of March 24, can you write 10th April's inventory? Chichi. It's not correct. When you prepare balance sheet as on 31st of March, can you write 10th April's inventory? You should write 31st of March inventory. How do you write 31st of March inventory when you already went 10 days ahead in time? Can you take one time machine and then come back by 10 days? No. You will count 10th April's inventory and then keep it. Ask them what happened in this last 10 days. They'll take all the data. You remove the impact of transactions that has happened in these 10 days. During these 10 days, whenever they made purchase, they've added. During these 10 days, whenever they made sale, they've deducted. We will do ulta. Whatever sales they've deducted, I will add. Whatever purchase they've added, I will deduct. By this, I will take them back in time from 10th April to 31st March. I'll find the inventory and then give it to them so that they can use it in their balance sheet and trading P&L. Can we do this?
Yes, sir.
Focus. What was the inventory on 10th April? 4,50,000 at cost. I want little energy and I want you to respond whenever I ask a specific question. Answer to my questions will be there in my question only. I want you to listen and answer. So what is the physical inventory on 10th April? Say simple question. I'm not expecting you to think and answer something new. It's here only. What are we trying to find? Inventory as on 31st March 2024. Am I going forward in time or am I going backward in time? When we're going forward, what do we do with purchase? What do we do with sales? When I go backward in time, what do we do with purchase? What do you do with sales? Very good. But when you do sales, do it net of sales return. When you do purchase, do it net of purchase return. Purchase minus purchase return will be always at cost. There's no problem. But when you do with sales minus sales return, it will be at selling price. Remember to eliminate the profit margin and then take it to outer column. Nice. Come on. What is the details? Goods sold to customer. Between these 10 days, what happened? Goods have been sold to customer 1,10,000. Yeah, 1,10,000 goods have gone out. So they have deducted. It's right. But when we're going backward, what do I do? Add. You understood? Add should not be sales. Add is cost of goods sold. Add is not sales. Add is cost of goods sold. So I'll write sales of 1,10,000 in the inner column. If there is sales return, I'll deduct that first. Then I'll get net sales. Then I'll deduct profit margin. Then I'll take it to outer column. Sir, what if sales return is not there? I will write 0. 1,10,000 minus 0, 1,10,000. Sir, what if profit is 0? Profit will not be 0. There will be some ratio. Deduct it and then write. If you're getting profit as 0, you'll get 0 marks. Why? Kottore, your eyes are blind. You did not read correctly. So if you don't read question correctly, what will they give? Kotte, 0. Then sales return 10,000. What do we do? Sales return. Deduct from sales. 1,10,000 minus 10. 1 lakh is net sales. Everybody got 1 lakh as net sales? Then come to third point. Purchases 85,000. Includes cash purchase 10,000. Adukeniga. Hey, whether it is cash purchase or credit purchase, how does it matter? Purchase 85. That's it. In that they're telling cash purchase is 10, credit purchase is 75. You keep it. I don't care. Purchase is what I need. I don't care whether it is cash or credit. Sales also. All that I care is sale. This is just that extra piece of information that they're giving to irritate you. You don't get irritated by all this nonsense information. It has no significance. Ignore and go forward. Purchase 85,000. Purchase usually we add. Am I right? Because this is backward problem. What do I do? Very good. I'll write less purchases. How much? 85,000. Done. Why is it in inner column? From this 85,000 purchase, I would deduct purchase return and then take it to outer column. Come to next item. Then after purchase return, 2000, purchase return is 2,500. I will deduct it from these purchases. Less purchase return 2,500. What do we get? 85 minus 2,500. Sir, sales you still kept in inner column. In sales, I have to eliminate profit. In purchase and profit irodilla. Chapati. I should not scold, no. So I told word which can be used as scolding, but it's not. You got it? Yeah. Next. I got it from you people only. Students only taught me. Meaning like they were scolding each other and I learned it. Yeah, inter you should see one batch. One guy calls the other guy vade. You will only vade and karitane. I thought idli also you can call, chapati also you can call, chutney also. Chapati. Focus. Goods costing 15,000 received in March for sale on consignment basis. Hey, you remember our discussion, consignor, consignee, goods and return. Here, I am not sending. I am the one receiving. I am the one. Wait a second. Did I buy the goods? I am commission agent. I sell my inventory. My friend has told, okay, bro, I have some inventory, bro. Can you sell this? I'm like, okay, send. Kalsu, I will sell. He sent it to me. I will sell and I'll give the money back to him. I am only an agent. The relationship between me and him is that of principal and agent, not that of buyer and seller. He will give the inventory to me. I will take. I will sell. I will collect the cash. I will give it to him. He will only give me little commission. Are you getting it? So, this inventory is not mine. Is it mine? No. Have I purchased? No. Is it in my godown? Yes. So, when I count my godown inventory, by mistake, I might have included this also. We have no your starting point. 4,50,000. This is all the inventory that's there in my godown. By mistake, if this 4,50,000 includes any inventory which is sent by my consignor to me, I should remove its impact. Got it? Yes, sir. Focus. How much was he sent? How much it is sent? 15,000 on for sale on consignment basis. 60% I've already sold by 10th April. 1 second. When did we do the physical count? Before I counted the inventory on 10th April. No. Out of 15,000 inventory, what I've received, 60% I've already sold. So he gave me 15,000. You do into 60%. 9,000 I've given it to somebody. How much is remaining with me? 15,000 minus 9,000 or 15,000 into 40%. 6,000 inventory is there in my Kodo. How much did I receive? 15. How much have I already sold? 9. How much is there in my Kodo? 6. Is it mine? Is it mine? Why did you add? You already added here. 4,50,000 include there. When they counted everything. Shall I deduct this? Say something. Very nice. Less unsold consignment stock minus 6,000. You have doubt? You have doubt. I'll give you one FYU for your understanding. See here. Stock received 15,000. Sold by 31st of March or sold by 10th of April. Sold by 10th of April or sold before stock taking. Before counting the stock, I've sold how much? 60%. Done. It's not included in the stock, so no adjustment required. Not included in stock as on 10th April. Is it included? Hell yeah. So do I have to adjust it as it is sold? So no required adjustment. Required means required. You understood? What about the balance 40%? It is with me. Remaining in stock on 10th April. It's with me, but it's not mine. It's in my godown, but it is not mine. When I counted, ಅದನ್ನ ಬಿಟ್ಟು ಎಲ್ಲ ಕೌಂಟ್ ಮಾಡಬೇಕಿತ್ತು. ಅದು ಆಟಕ್ಕುಂಟು ಲೆಕ್ಕಕ್ಕಿಲ್ಲ. It is like that small kid whom you play cricket with. You count that person as a player, but you don't get him out. You don't bowl fast to him. You bowl him slow ball. You don't want him to get out. You understand this? Hey, sure. So this specific inventory item, it's not ours. It should have been not included in the inventory. But when we counted the inventory, we've already counted it. So what do? I will deduct. It should have been not included, but it's been already included. Because it is already included, I would now deduct it. This stock doesn't belong to us. So it has to be deducted from 10th April. Doesn't belong to us. But included in stock taking. So it has to be deducted from stock on what date? 10/4 means, sir, 10/4 is 2.5. Angalla. Adu date 10th April. You understood? Say something. You wrote 2.5. Okay. ನಿಮ್ಮಂತವ್ರೆ ಯಾರೋ ಕಿತ್ತೂರು ರಾಣಿ ಚೆನ್ನಮ್ಮ ಅಂತ ಹೇಳ್ಬಿಟ್ಟು ಕೆಳಗಡೆ ಬರ್ದಿದ್ರೆ ಇಯರ್ ಫೋನ್ ಮಾಡ್ತಾ ಇದಾರಂತೆ ನಮಗೆ. ದಟ್ ಈಸ್ ಬರ್ತ್ ಇಯರ್, ಡೆತ್ ಇಯರ್, ಇಡಿಯಟ್. ಕಾಲಿಂಗ್ 4 ದಿನದಿಂದ ಫೋನ್ ಮಾಡ್ತೀನಿ, ಫೋನೇ ಪಿಕ್ ಮಾಡ್ತಿಲ್ಲ ಅಂತ. ವೈ? ಐ ಹ್ಯಾವ್ ಎ ಡೌಟ್. ಇನ್ ದ ಬ್ರಿಟಿಷ್ ವಾರ್, ಡಿಡ್ ಯು ವಿನ್ ಆರ್ ಡಿಡ್ ದೇ ವಿನ್? Focus here. History teacher died. Okay, sixth point. After, see, this was not included in above sales. Obviously, no. Is it our inventory? How can I sell what's not mine? I'm only agent. I sell that, no, on behalf of the consignor. He should record sales, not me. I'll sell the goods, collect the cash, give it to him. He will record sales. I will not record sales. I will only record commission income. And they've correctly not included in sales. If they had wrongly included in sales, then I would have deducted. But don't worry, they have not done that mistake. Then, after stock was taken, meaning counted. Taken means not stock taken. Stock taken means counted. What does stock taken mean? Counted. Then it was found that there was certain very old and slow moving item. One item is senior citizen, very old, bought long ago, not yet sold. It is slow moving, very old, no, moving slowly. So this is very old item and very slow moving item. What is the cost at which it was bought? 14,850. Now there is more better inventory in the market. There is new inventory. Youth, new inventory, full fast moving. This is old stock. Nobody will buy. So because nobody will buy it, people will say that they will buy, but not at a price more than cost. They will buy it at a price lesser than cost. If they buy it at a price lesser than cost, NRV is lesser than cost. I told you as per para 5 of accounting standard 2, inventory should be valued at cost or NRV, whichever is less. If you expect to sell it at a higher price, profit, don't book. Wait to sell, then record profit. If you expect to sell it at a price lesser than cost, loss. Book it now. What are you waiting for? Book now. Check the number. That's there in the description. Yeah, limited seats only. What else do you say? Don't know. Whatever. Yeah. See, 14,850 is the cost. It should be taken at what price? 9,500. One customer is interested in this old product also. Is like, yeah, one customer. This customer is like, I'm interested, I will buy it, but I can't give you what you expect. 14,850 is too much. I will give you 9,500. ಆಮೇಲೆ ನಿನ್ನ ಇಷ್ಟ. 9,500 is NRV. 14,850 is cost. We'll record it whichever is less. If you have to revalue 14,850 worth of inventory to 9,500, you should do downward revaluation. Remember doing partnership downward revaluation like that. Already 14,850 is included in this. In the place of 14,850, I should write 9,500. How do I do that? I will reduce. How much will I reduce? 14,850. This is old working note. 5,000. 5,350 minus. You understood? Alternatively, I can teach you a detailed working note here. Slow moving item. Cost 14,850. Expected net result value 9,500. Whichever is less, 9,500. Already recorded at 14,850. You should bring it down to 9,500 by writing down 5,350. Got this? 5,350 I just deducted here. What do we have after that? Everything's done. They told goods are sold at a profit margin of 25% on cost. You remember discussing? Don't tell I was over my X, but my X was with someone. Sorry, that 1 by X, 1 by X plus 1. Don't tell that. Cost on cost, 25% means 25 divided by cost. 25 divided by cost. Cost is 100. If you have to find it on profit, on sale, what should you do? 25 divided by 100 plus 25. Cost is 25. Percentage on cost. So cost is 100. Cost is 100. Profit is 25. How much is selling price? Cost is 100. Profit is 25. How much is selling price? 25,000. Cost is 100. Profit is 25. Selling price 125. If you have to do profit on sale, what will you do? 25 by what? 25. You got the logic? Profit by cost. Profit by cost plus profit. 25% on cost is 25 by 100. Am I right? Profit on sale will be Profit divided by cost plus profit. Cost is 100, profit is 25. Selling price is how much? 125. So do 25 by 125. 25 by 125 on 1 lakh. 25% on cost. So 25 divided by 100 on cost. 25 divided by 125 on sale. Do it. 1 lakh into 25 by 125. 20,000 is profit. If you deduct, you will get 80,000 as the cost of goods sold. ನೋಡ್ತಾ ಪೂರ್ತಿ ಪ್ರಾಬ್ಲಮ್ ಮುಗ್ದೋಯ್ತು 5 marks. What to do now? 4 lakh plus 4 lakh 50 plus 80, 5 lakh 30, minus 82 500, minus 6, minus 5,350.
4 lakh 36.
Yes, 4 lakh 36,150. This is the answer. Book value of inventory as on 31st of March 2024. May God bless you with good marks in valuation of inventory in the exam that you write. Can I go to next one? How many of you could finish it alongside? Good. Next, what do we have? Come on, let's do the next one. Attempt one of the above two parts. Oh, sorry, below two parts. Let's see. Prakash runs a factory. Yake running? You can keep it standing also. Maybe some running factory which produces pressure cookers. Pressure cooker will be jumping, no? Just imagine pressure cooker having two legs and running. The following details are obtained about its manufacturing expenses. Okay, I told this to you. Remember, manufacturing account when you prepare. Opening work in progress, debit side. Closing work in progress, credit side. Below that, consumption of raw material. Opening plus purchase minus closing. Manufacturing expenses debit, sale of scrap credit. You will find balancing figure as cost of production. That's it. We have opening WIP 6 lakh 25. We have closing WIP 7 lakh 15. I would write in my manufacturing account debit side opening work in progress. How much? 6 lakh 25. I would write closing work in progress 7 lakh 15. Do I have data for consumption of raw material? Yeah, not directly, but yes. We have opening, we have closing, we have purchase. We do opening plus purchase minus closing. I would write here consumption of raw material. I would write opening raw material plus purchase minus closing. How much is opening? Yeah, purchase written if it is there, we'll deduct. Opening is 5 lakh 85. Purchase is 18 lakh 74. Closing is 4 lakh 70. And just below, there only, they have given purchase return. Deduct it from purchases. 95,000. 95,000. How much is consumption? 18 lakh 94,000. I hope you understood consumption of raw material. What do we write after that? There is some indirect material used 1 lakh 88. Direct material is what you can see on the product. Indirect is material used in manufacturing, but you don't see with the naked eye, but it's still used. Okay, how much is indirect material used? 1 lakh 88. I'll write indirect material 1 lakh 88,000. What's after indirect material 1 lakh 88? Direct wages, indirect wages, power, electricity, repairs, maintenance, depreciation on factory shed, depreciation on plant and all of these are expenses. 397, 82, 176, 265, 144, 162. Write them. Manufacturing expenses direct wages 3 lakh 97. Power and electricity, sorry, indirect wages 82. Power and electricity 1 lakh 76. Then repairs and maintenance 2 lakh 65. Then depreciation, factory shed 144, machinery 162. 144, 162. I wrote all the expenses, whatever they have given. What do we have after all the expenses? Then we have sale of scrap. How much? 36. Sale of scrap 36 will be written in the manufacturing account on the credit side. Sale of scrap 36. This is reduction in the cost of production. Right? It is reduction in cost of production. Everything done? Yeah. 5 marks. Loading. Yeah, identify cost of production. Cost of production is the objective of manufacturing account. You will not find profit. Profit is gross in trading, net in PL. Take the total on the debit. 625 plus 1894 plus 1,88 plus 397 plus 882 plus 176 plus 265 plus 144 plus 162. 39 lakh 33,000 minus 36,000 minus 7 lakh 15,000. 31 lakh 82,000 is the cost of production. 31 lakh 82,000 is the cost of production of finished goods. I hope you understood. If I was preparing trading account, in my trading account on the debit side, below opening stock, I would have written purchases 31 lakh 82,000. I hope everybody got this. Let's go to next one. 5B2, the second choice question, because we're not solving for 100 marks, we're solving for 125 or 124. This 125 paper. Can we do 5B2, which is on PRS from May 2024, that is June 2024 exam? From the following particulars, prepare bank reconciliation statement of a businessman as on 31st March. They have given bank overdraft as per cash book. Overdraft balance means opening balance as per cash book is negative. You also write the same way. Overdraft balance as per cash book, what they've given is 24,000. Don't write overdraft balance as per cash book 24. Write balance as per cash book. Write the amount as minus 24. Don't write overdraft balance 24. Keep the numbers negative, not words. Write balance as per cash book minus 24,000. Let's begin. Check deposited as per bank statement but not recorded in cash book 4,000. Check is being deposited. When you deposited the check, your balance as per cash book has increased. Sorry. Oh, but not recorded in cash book. When you usually deposit, cash book will increase. When it gets cleared, passbook will increase. But in this case, you know what happened? Oh, sorry. This is cash book C. This is passbook P. So you deposited the check, but you did not enter in cash book. Because you did not enter in cash book did not move. But the check got cleared, passbook has increased. You deposited the check, you did not enter in cash book did not move. Passbook moved upwards because the check got cleared. Can you see the P? No, you cannot see the P because they're not in the same line. In order to see the P, what should you do? Either you should P down or you should C up. So what is in our control? C. You can't control P. So what do? We see up, meaning up. C means cash book. Cash book up. We'll add in cash book. Yeah, last batch someone tried peeing up. Andre, illi they tried to add to passbook balance which is not there. Working against gravity doesn't work. Yeah, gravity will work even if you are a commerce student. Then next adjustment. Cash received from X. X gave us cash. No, his name itself is X, not your X. Was entered in bank column of cash book. Are you sure? X gave cash? No. You should write in cash column. We started looking at X and then we wrote in bank column. So in our cash book, bank column has gone up. So there is incorrect increase in cash book. Will the bank balance increase? You made the mistake in cash book. Why will bank balance increase? It will not. Are you getting it? Bank balance as per cash book has increased incorrectly. Passbook balance has not. Where are we making changes? Cash. What do I do? Minus. Shall I deduct 3,150? 1 second. Have they asked you to do amended cash book? No. Can we do? Yes. But 5 marks ಕೊಡ್ತೀಯ ಅಷ್ಟೇ. They're giving only 5 marks. इतने marks के लिए इतना इंच मिलेगा. You give me 10 marks, I'll do amended cash book. Or you ask me. At least then I'll prepare. You don't ask, you don't give marks also. Too much, bro. 3,150 wrongly increased in cash book when there was no receipt in bank column. So we will deduct cash book by 3,150. Debit side of bank column casted short. What do you mean by debit side? Debit side is receipt side. Receipt is inflow. Casted short means decrease. We have not recorded one receipt. Or we have recorded one receipt at a lesser amount. Basically, we've reduced our cash book balance by 1,000. We've reduced one cash book balance by 1,000. Receipt side. If you book a receipt, cash book balance will increase. If you don't write that receipt, cash book balance will decrease. 1,000 rupees money is received. You did not write it in cash book. Cash book decreased. Passbook is not. Where are we making changes? Cash. What do I add? How much do I add? 1000. Observe. Add 1000. Debit side of bank column casted short. What's after this? A check for 9,000 deposited but collection as not collected. No. Deposited but collection as per bank statement is 8,950. Oh, check for rupees 9,000 deposited but collection as per bank statement is 8,950. How much did you increase your cash book by? 9,000. How much did the passbook increase? 8,950. Sir, how come you have deposited 2-3 checks together? You deposited 2-3 checks together. 2-3 checks together, it is 9,000. Cash book increased by 9. In the passbook, some checks are cleared, some checks are not. To the extent checks are cleared, it is 8,950. How much is difference? 50 rupees. 50 rupees worth of checks which has been deposited is not cleared. 50 rupees worth of checks which has been deposited is not cleared. Check deposited, not cleared. Or cash book went up by 9,000. Passbook went up by 8,950. Difference 50. Where are we making changes? Cash book. What do I do? Deduct. By how much? 50. I would write here less. Check deposited, collected short in passbook. Or maybe we've done totaling error, or maybe they've done totaling error. One of the possibilities also there. Minus 50. Understood? What do we have after this? Minus 50 done. Bills sent to bank for collection. Collected by the bank but not recorded in cash book. I have given one bill to bank. Banker collected the money. Banker has recorded in the passbook. My passbook balance has increased, but my cash book balance has not increased. My passbook balance has increased, but my cash book balance has not increased. Where am I making changes? Cash book. What do I do? Add. How much? 4,200. 4,200. Done. Next, bank charges recorded twice in cash book. Should record once in cash book. Cash book will decrease. Should record in passbook once. Passbook will decrease. Someone told you should do double entry system. Double entry and you recorded 2 times in cash book. Double entry means recording 2 aspects of the same transaction, not writing the same transaction 2 times. So what did you do? You are supposed to deduct 40 rupees as bank charges. Passbook went down by 40. Cash book you did minus 40, minus 40. So cash book has gone down by 40. Am I right? Gone down by 80 when it was supposed to go down by 40. So it's gone down extra by 40. Where are we making changes? Cash book. What do we do? Add. How much? 40. 40. Bank charges. Deducted twice. Added back. Got this? Next. Noting charges. Maybe there is some bill which is dishonored. Debited in passbook for discounted bill 60. So passbook they've deducted noting charges. Passbook has gone down. In cash books, you have not recorded the transaction. You have to record now. Recorded in passbook. Passbook has gone down. Cash book you have not recorded. I will reduce cash book now. By how much? 60 minus noting charges 60. Done. What's after this? Checks deposited on 25th March 2024 but collected by 5th April. Sir, it's deposited uncollected. We are doing PRS on 31st March. It is deposited on 25th March. It is cleared on 5th April. As on 31st March, cash book has increased because of debit. Passbook has not increased. Passbook will increase on 5th April. On 5th April, both have increased. On 31st March, cash book has increased. Passbook has not. Where are we making changes? Cash book. What should I do? Deduct. How much should I deduct? 4,800. I'll write here less. Checks deposited but not cleared. 4,800 rupees. Got this? Next, checks issued 26th March but presented for encashment 6th April. I gave the checks to my customer on 26th March. He cleared the checks from the banker on 6th April. So on 26th March, my cash book decreased. My passbook will decrease only on 6th April. On 26th March, my cash book decreased. My passbook will decrease only on 6th April. Meanwhile, on 31st of March, cash book has decreased, passbook has not. We're making changes in cash book. What do I do? Add. How much? 3,000. Ta-da! Done. That's it. Find the balance. minus 24 plus 4 minus 3150 plus 1000 minus 50 plus 4200 40 minus 60 minus 4800 plus 3000 minus 19,820. Remember the symbol. Right here, balance as no, write bank balance as per passbook minus 19,820. Don't write overdraft balance minus 19,820. Write bank balance as per passbook 19,820. If you use the word overdraft, right here 19,820. If you use overdraft, you should not put symbol. If you put symbol, you should not put overdraft. If you write bank balance minus 19,820. Overdraft balance 19,820. First use mathematics correctly, then play with English. Just take number negative, identify this. Minus 19, you write bank balance. Then shift this minus this side, make this overdraft balance. You will be like, sir, I want to write bank balance as per passbook. I want to write 19,820. What do I do? Write it as debit balance as per passbook. Debit means negative in passbook. Credit means positive in passbook. In cashbook, debit is positive, credit is negative. This is how you can present the same answer in three different ways. All the ways the answer is same. Let's now do question 5C from our June 2024 exam paper. This question 5C is from the topic of company accounts. Let's see. Following is abstract. Abstract means extract, not complete balance sheet. They've given little data what is needed. They've not given full balance sheet. Why? You can't handle it. Happy Limited as on 31st March 2024. Come to the end. What do they want? They want you to pass journal entries in the books of company on the basis of above decisions. They've taken some decisions. They want you to pass journal entry. 10 marks. Let's do it. On 1st April 24, company makes final call at rupees 6 each on 40,000 equity shares. Observe how many equity shares are there here. 40,000 equity shares of 10 each are only 4 rupees paid. So they will call balance 6. We will call. What is the entry when you call? Share call is receivable asset. Share call account debit. Am I right? Whenever you call for share money, share capital will increase. So you have to credit share capital. Journal entry will be equity share call account debit to equity share capital. Equity share call account debit to equity share capital. How many shares? 40,000 shares. How much per share? 6 rupees per share. 40,000 into 6. 2 lakh 40, 2 lakh 40. This is call made. If you receive, bank balance will increase. Share call, the receivable asset will decrease. Bank account debit to share call. If you don't receive, it is call made, they did not pay, it became missed call. No, calls in arrears. You will record calls in arrears account debit to share call. Sir, what if they pay partly and they don't pay partly? To the extent you receive, you debit bank account. To the extent you don't receive, right? Calls in arrears account. Are you getting it? Sir. Come on, let's see. What do we have? Did they pay? On 1st of May, Board of Directors made the following decision. To forfeit the shares on which final call rupees 2 is due. The call money is duly received on 30th April. This call money we received. Whatever this call we've done, no, that money is received. I would write the entry bank account debit to share call 2 lakh 40, 2 lakh 40. Call is made, money is received, over. There is one more calls in arrears here. See here, 20,000 against 10,000 shares for 2 rupees. Some other shares, they have not yet paid money. So what did the company decide to do? Forfeit. Forfeit means what? Company will take the share back from that shareholder. Return the money, what they've done? No. Take the share, and when they ask money, you will do like this. Share kitkonde kaas kodala. Why? If you would have given me that balance 2 rupees, I would have left the share with you. How many times should I call you for 2 rupees? I also have respect. If you don't give me my 2 rupees, I will take the share back from you. That's what the company done. When they forfeit the share, share capital will decrease. So debit share capital. When you made the call, you had credited. When they don't pay, capital will decrease. Debit share capital. How many shares? How many shares? 10,000. How much per share? 2 rupees. 10,000 into 2. Sorry, full value will decrease. 10,000 into 10. 1 lakh share capital will decrease. Debit. Now, they had given some money. Whatever money they had given will be returned to them. No, that money will become my profit. It will be kept in one temporary profit account called share forfeiture account. Where will I keep it? Very good. How much profit per share? How much we had collected previously? 8 rupees per share for 10,000 shares, 80,000. Calls in arrears was there, no? 2 rupees I called, they did not pay. That's my asset. That's my asset, would have been recorded as a balance sheet asset or deduction from capital. Now, if I forfeit the share, can I still ask him for money? After I forfeit, how can I ask? I cannot ask. So that asset what was there has to be now reversed. Calls in arrears will be reversed by crediting. How much? 10,000 into 2, 20,000. This is forfeiture entry. Share capital is decreasing, debited. There is profit. The money that you had previously collected, you are not returning. Credited to share forfeiture, and the money which they had not given, which you had recorded earlier as an asset, will be no longer received. So you credit it to calls in arrears account. Understood? Entry is share capital account debit to share forfeiture, to calls in arrears. What do you do after with these shares? To reissue the forfeited shares at rupees 11 each. You will reissue these shares. Reissue means you will give it to somebody else. At what rate? 11. Nominal value 10. How much did you collect? 11. 1 rupee is premium. 1 rupee is premium or profit? Premium. If you collect more than nominal value, premium. From one person only, if you collect more than nominal value, premium. Are you getting it? From the old person and the new person, together you collect more than nominal value, profit. Are you getting it? First you take out the premium and then you see if there is any profit. How much did you collect from the new shareholder? 11. First of all, 11 collect ಮಾಡಿದ್ರಲ್ಲಿ 1 rupee security premium you keep aside. How much did you collect from the new shareholder other than the premium? 10. How much had the old shareholder paid? 8. How much had the old shareholder paid? New shareholder paid? Together you collected 18. Nominal value is 10. 8 rupees profit. 8 rupees? Sir, 1 second. How much did the new shareholder pay? 11. In that 11, how much is premium? 1 rupee you keep aside. Balance money collected towards nominal value? 10. From the old shareholder, how much had you collected? 8. Because he did not pay 2. Together they paid 18. Old shareholder paid 8, new shareholder paid 10. 10 plus 8 is 18. Don't give that expression. Together it is 18. Nominal value of the share is 10. 8 rupees, whatever you collected extra, is profit per share. There is one more way to compute this. Old shareholder paid how much? 8 rupees. How much discount can I offer on reissue to the new shareholder? 8. How much discount can I offer to the new shareholder? 8. Am I offering discount to new shareholder? No, is paying premium. Full 8 rupees what the old shareholder had paid will become profit. 8. It is one more way. One more way. Old shareholder paid how much? How much did he not pay? How much should I collect from the new shareholder? 2. How much should I collect? 2. How much did I collect? 11. 8. And how much did I collect? In that 11, 1 rupee premium you remove. 10 towards nominal value. You are supposed to collect 2. You collected 10. 8 rupees what you collected extra is profit. Heng madru will come at the same number. You can deal with the amount also. Old shareholder paid. Old shareholder paid how much? 8 rupees. Am I right? For how many shares? 10,000 shares. Do 10,000 into 8. 80,000. New shareholder paid 10,000 into 11. 1 lakh 10. In that 10,000 is security premium. Keep it aside. 1 lakh. 1 lakh collected from new shareholder. Am I right? 80,000 collected from old shareholder. Together 1 lakh 80. Nominal value is 1 lakh. 80,000 rupees is profit for 10,000 shares. Each share 8 rupees. I'll teach you one more way using journal entry. SAR. Bank account debit. How much money did you receive? All 10,000 shares are reissued at rupees 11. 1 lakh 10. Credit. Equity share capital. 10,000 into 10. 1 lakh. Extra collected 1 rupee. Security premium. You got it? Then all the shares forfeited are reissued. Am I right? Take share forfeiture account. How much credit? 80. Is there any debit here? No. That 80,000 is profit. Close it by transfer to P&L. Share forfeiture account. Sir, that way also we can do. Yeah. To capital reserve. Here you have 80,000. Here you have 80,000. That is not used for reissue here. Full 80,000 is profit transfer to capital reserve. What if we had used some 10,000 discount here? 80,000 minus 10,000. 70,000 would have been transferred. Don't do straight away deduction in journal. You know why? What if sometimes they give not all the shares are reissued. You forfeited 10,000, but you reissued only 8,000. In that case, direct journal entry minus will not work. Should have the logic of nominal value, premium, how much old shareholder paid, how much new shareholder paid, together how much have you collected, in that how much is nominal value, how much is profit. That computation mindset is very important, needed. If you don't do that, you're just working on gray time. Some questions you get it right. If the question is slightly twisted, Dhamma, do it. Peace. Next, reissue done. To issue fully paid bonus shares in the ratio of one fully paid bonus shares for every 2 shares held. They're going to give 1 share for every 2 shares as bonus. Okay, help me. If you have 2 shares, they will give 1 share. How many shares are there? How many shares are there in the balance sheet? In the balance sheet, there was 90,000 equity shares. In this 10,000 shares, there was arrears. Am I right? What did we do? Forfeit and reissue. Previously, it was 90,000 shares. In that, calls and arrears was there. Now, is there calls and arrears? No. Now it is 90,000 shares fully paid up. And this 40,000 equity shares are also fully paid up. So totally, how much equity shares do we have? 90 plus 40. We have 1,30,000 equity shares of rupees 10 each fully paid up. How much equity shares do we have? 1,30,000 equity shares of rupees 10 each fully paid up. For 2 shares, they'll give 1 share as bonus. For 2 shares, they'll give 1 share as bonus. For 1,30,000 shares, how many shares will be given as bonus? 65,000. Am I right? 65,000 shares. Each share is how much? 10. Each share is how much? How much reserves do we need to give bonus issue to that extent? 6,50,000. What is the order in which you can utilize reserves to make bonus issue? Start with capital redemption reserve. If that's not available, that's not sufficient, then security premium. Security premium can be used only to the extent realized in cash. If security premium is not sufficient, then I'll go to capital reserve. Capital reserve cannot be utilized if it is revaluation in nature. If it is not realized in cash, you cannot use it. So security premium, if it's not sufficient, capital reserve, that's also not sufficient, then general reserve, finally P&L account. Order CRR, SP, CR, GR, PL. Shall we go ahead?
Yes, sir.
Help me out. Capital redemption reserve. Is it there? Is it there in the question? Yeah. It's there. How much? 1,60,000. I would write here 1,60,000. Then after capital redemption reserve, security premium. Is it there? Yeah, 1 lakh. They have not mentioned whether realized in cash or not. Remember, if nothing is mentioned, assume security premium is realized in cash. If nothing is mentioned, assume capital reserve is not realized in cash. Once again, if nothing is mentioned, always assume security premium is realized in cash. If nothing is mentioned, always assume capital reserve is not realized in cash. Why? Logic. Security premium means shares are issued at a price higher than nominal value. Security premium will be usually collected in cash. Very, very rarely you will give shares to vendors from whom you purchased asset. You will give shares to debenture holders. You will give shares to preference shareholders. If you see the possibility, would you often issue shares for cash or would you often issue shares for non-cash? Cash. So if nothing is mentioned, it is realized in cash. Are you getting it? Now, capital reserve, how will it come? Two situations. One, forfeiture of shares. Profit will be transferred to capital reserve. Second situation, revaluation reserve. PPE, revalued upward. PPE account debit to revaluation reserve. You discussed in depreciation chapter. So, two situations in which capital reserve will come. One, revaluation of the asset upward. Two is forfeiture of shares. You tell me what is more often. Asset will be revalued more often. How often will you forfeit shares and reissue? Very less, very rare. You can revalue the asset. No, often. Will you often is your hobby forfeiture reissue? No, it's a very rare situation. If nothing is mentioned, capital reserve is not realized in cash. If nothing is mentioned, capital reserve is not realized in cash. Only if they mention it is realized in cash. Are you getting it? In this question, they mention it is realized in cash. We'll use CR, but only after security premium. Make a note, write it as a tattoo on your hand. Security premium, if not mentioned, assume it to be realized in cash. Capital reserve, if not mentioned, assume it to be not realized in cash. Does it make sense? Everybody got that? Observe. I would write here security premium. How much is there? 1 lakh. I need 6 lakh 50 to do bonus issue. 1 lakh 60 plus 1 lakh 10. 10,000 here we got, no? Now, just now when you issued the shares, reissued, you collected 10,000 premium. 1 lakh is there in balance sheet. 10,000 came in, reissued, together 1 lakh 10. If you take 1 lakh, gone. Answer will be slightly incorrect. Marks will be lost slightly. By 2-3 marks you lose. Then CRR done, security premium done. Capital reserve. Can I use? Yeah. Why? They only mentioned that is realized in cash. How much? 60. 60 was there in balance sheet. Right now we transferred some amount to capital reserve. Is this realized in cash? Yes. Old shareholder paid cash. New shareholder paid cash. Together we've collected more cash than the nominal value. Extra cash collected. Profit on reissue of forfeited shares. Can this 80 be used? Yes. How much is there in balance sheet? 60. How much in that forfeiture entry? 80. Together 1 lakh 40. Is it sufficient? 160 plus 110, 270. 270 plus 140, 310, 410. What do we need? 650. We have to go to general reserve. How much is there in general reserve? 120. Can I take full 120? Till shortage. Do 650 minus 160 minus 110 minus 140 minus 120. 1 lakh 20. That's P&L account. Do we have so much in P&L? Oh, we have 7 lakh. We have how much? How much did I utilize out of 7 lakh? Only 1 lakh 20. I hope everybody got this. Okay. I have to debit these reserves because these reserves are decreasing. Credit will be given to one dummy account called bonus to shareholders. Then write bonus to shareholders account debit to equity share capital. What is the entry? Reserve to bonus. Bonus to share capital. Reserve to bonus. Bonus to, shall I? Come on, let me write here reserves. Capital redemption reserve. Capital redemption reserve. How much? 1 lakh 60. Security premium. How much? 1 lakh 10. Capital reserve 1 lakh 40. General reserve 120, P&L 120. General reserve 120, P&L 120. Credit bonus to shareholder 6 lakh 50. Then bonus to shareholders account debit to equity share capital 6 lakh 50. By this we are done with accounting entry for issue of bonus shares also. Bonus shares issued is capitalization of reserves. I hope you guys got it. Cool. Done. Next question. 5C done. 6A. What's happening in 6A? Balances appeared in the books of MAC Limited as on 31st December 2023. This is question on reduction of preference shares. Shall we do it? Come to the end. What do they want? You are required to pass necessary journal entries, including narrations, to give effect to the above arrangement. Also prepare notes to accounts for share capital, reserves and surplus relevant to balance sheet immediately after the redemption of preference shares as on 31st of March 2024. Ignore the date column in journal. Okay. See what is the transactions that they're entering into. Their preference share capital is not fully paid up. Remember this point. Whenever the preference shares are not fully paid up, you cannot do redemption. In order to do redemption, shares have to be fully paid up. In this state, even if they directly tell redeem preference shares, we will assume we made the call. We will assume they paid the money. We will assume that we've received the money. Only then we can do redemption. Can I straight away do redemption? No. I have to make that call. 100 rupees each share is paid up only to the extent of 75. Right? Share call to share capital. 25 rupees per share for 80,000 shares. After that 25 rupees per share for 80,000 shares, share call being made, you will receive money. Bank account debit to share call of that money. Then only redemption. See what have they told? Under the terms of their issue, preference shares are redeemable on 31st of March at a premium of 5%. That we'll see later. Shall we first do issue? Sorry, shall we first do call? What is the entry when you make the call? Call. We'll make the call. They've told for that purpose, they've done some issue of right shares also. I think we'll go by the order. We'll do that. But before we do that, see what they've done. Premium of 5% is applicable. In order to finance the redemption, the company makes right issue. What do you mean by right issue? Issue of shares to the existing shareholders of the company at a price lower than market price. What is bonus issue? Issue of shares to the existing shareholders of the company free. Issue of shares to the existing shareholders of the company free. Bonus. Issue of shares to the existing shareholders of the company at a price lesser than market value. Right issue. If we issue it at lesser than market value, it is what are you telling? Always you have to issue at greater than nominal value only. Issue of shares at discount is forbidden. That need not be told. That's assumed. Always. Let me please do it. If you issue the shares to existing shareholders free, bonus. If you issue the shares to existing shareholders at a price lesser than market price, that becomes right issue. Right issue. How many shares? 60,000. Nominal value 100 at a premium of percent. Sir, you told lesser than market value. In the market, these shares might be at 150. We're issuing to them at 110. Are you getting it? If I issue it at market price, why will my existing shareholders buy from me? They'll buy from market. Are you getting it? Yeah. Let's write the entry here. Bank account debit. Are they collecting on application allotment or something? Yeah. 25 on application. 45 including premium on allotment. Premium is 10 rupees. Observe, 25 rupees on application, 45 rupees including premium on allotment. See, 25 rupees on application, no premium collected on application, 25 will stay here. On allotment, when you collect 45, they've told 10 rupees premium. So I'll write 10 rupees in premium column. Out of 45, if 10 rupees is premium, can you say nominal value is 35? Yes. Have they given date on which this is happening? And the balance on 1st of August. 1st of August, I'm collecting the balance money. Total nominal value 100. Total issue price 110. 10 rupees premium. 100 minus 25 minus 35. 40. You get it? Now premium is not there. Premium is completely collected on allotment only. So call issue price also 40. They've told ignore date column, but anyways I have got it here. You can first write that share call and then receipt money also you can do preference share. They've told right issue, I'll finish right issue. Shall I do this? What is the entry? First, when you receive money, bank account debit to share application. How much? 60,000 rights into 25 per right, 15 lakh. Then this share application money will be transferred to share capital. You'll write share application account debit to share capital. How much? 15 lakh, 15 lakh. After this share application to share capital entry, what will we do next? We will make share allotment. Allotment money is receivable. Debit share allotment account, credit share capital. Entry will be equity share allotment account debit to share capital. But we all know on allotment, we are collecting premium also. Premium will not be included in capital. Premium will be credited to security premium account. How many shares? 60,000. Money receivable on allotment 45. Nominal value 35. Security premium 10. So we'll do 60,000 into 45 here. 27 lakh debited to share allotment. How much will go to share capital? 60,000 into 35. How much will go to security premium? 60,000 into 10. I hope you understood this. They mentioned the date. Have they? Ignore date. They've told issue was subscribed on 1st of March. If you want, you can write, but otherwise not compulsory. Then after the allotment, final call, 40 rupees. Call is made and money is received. See, the amount due on allotment was received on 25th March. So 25th March will receive the money. I'll write bank account debit to equity share allotment. Bank balance is increasing, bank account debit. Equity share allotment was the asset receivable that will decrease. Credit equity share allotment. By this, I'm done with application and I'm also done with allotment. Now I'll go to share call. When I go to share call, journal entry is oh no, they've not told anything about right shares. Right shares, They've told application done, allotment done, call is on 1st August. They've not told that the call is made. They've not told that the call is made. So we'll not write share call to share capital 40 rupees per share for 60,000 right shares. No. But I will make preference share call 25 rupees per share for 80,000 shares. Can I? Now I should redeem them. So I'll write preference share call to preference share capital. How many? 80,000 shares into 25 per share. 80,000 into 25. 20 lakh, 20 lakh. Done. Now, I am assuming that I have received this money. I'll write bank account debit to preference share call 20 lakh, 20 lakh for the money received honestly. Understood? Share call made, share call money received. After call is being made and money is being received, now we will redeem our preference shares. How much is preference shares? 60 lakh here. I credited it by 20 lakh here. Can I say 80 lakh is my preference share capital? Or in another language, I can say 80,000 shares of rupees 100 each. It was 75 paid up. Now it is become 80,000 shares of rupees 100 each, 100 paid up. So 80,000 into 100. 80,000 into 100. 80 lakh. What is 80 lakh? 80 lakh rupees is the preference share capital which is there in our balance sheet, which we are now redeeming. So preference share capital will decrease. When the preference share capital is decreasing, I'll debit preference share capital by 80 lakh. I have to pay this money to preference shareholder. I will credit preference shareholder. But I'm not paying 80 lakh to preference shareholder. Preference shareholder is saying that he wants to be paid how much? 10% premium? No, 5% premium. He wants to be paid 5% premium. Nominal value is 100. 5% premium will make it 105. So I need to pay how many preference shares were there? 80,000. So 80,000 preference shares into 80,000 preference shares into rupees 105. Am I right? How much will that come to? 84 lakh. What is the nominal value of preference share capital? 80 lakh. How much am I supposed to pay them? 84 lakh. I'm paying them extra. How much extra? Yeah, 5 rupees per share. 5 rupees per share premium on how many shares? 80,000 shares. How much do we get? 4 lakh. This should be debited to premium on redemption of preference shares. Very, very important point. This premium on redemption of preference shares 4 lakh should not be taken from security premium. It should not be taken from premium on redemption of preference shares, has to be adjusted to P&L account only. Sir, what if we don't have enough balance in P&L? Then you cannot redeem preference shares at premium. If you want to redeem preference shares at premium, you need to have sufficient balance in PL. Are you getting it? Sir, can some company do? Yes, if the accounting standards are not applicable to them. Example, banking, insurance, electricity, which is not there anywhere in your syllabus. So never ever will use security premium. You'll always use P&L account balance only. You don't even have to know that exception. Are you getting it? Cool. Now we need to pay them. Shall I pay my preference shareholder? Preference shareholder was a liability 84 lakh credited previously. I will debit it. I'll give them money 84 lakh. Damar. Closed. Understood? Now a very important point to note. Two things to do. One, this premium on redemption of preferences I should transfer to P&L. The next thing is my capital is decreasing. I would have to create CRR. First, let's close this premium. How much is premium here? Debit it to P&L. P&L account debit to premium on redemption of preference shares 4 lakh. Are you getting it? Next, how much is your preference share capital decreasing by? Focus. Preference share capital is decreasing by how much here? How much is preference share capital decreasing by? Capital of the company cannot decrease. Capital of the company should not decrease. If the capital of the company is decreasing, it has to be by way of reconstruction, which is approved by court of law. That is internal reconstruction chapter, what you learn in CA Inter. Redemption is actually not allowed. Buyback is actually not allowed. They allow it on a condition that the capital totally will not decrease. So how? 80 lakh capital decreased. Preference share capital was there. Now when you redeem, it will decrease, no? You need to fill that gap by creating CRR. You need to fill that gap by creating, what is CRR? Capital redemption reserve. When you create CRR on a later date, CRR will be used to do bonus issue. Then the capital will go back to same limit. How much is preference share capital decreasing by? Should create CRR for 80 lakh so that later CRR will be used for bonus issue and capital will increase by 80. But one second, we made some right issue. So preference share capital is decreasing. Equity share capital is also increasing. To what extent? Let us see. How much is there equity share capital here? No. Is there equity share capital here? Yes. How much? Take your calculator, type 15 lakh. 15 lakh equity share capital is increasing on application. Here, equity share capital is again increasing. 20 lakh. 15 lakh plus 20 lakh. Sorry, 21. 15 lakh plus 21 lakh. Can I say to the extent of 36 lakh? To the extent of 36 lakh, our equity share capital is increasing. We did not make call. Did we make call? No. 36 lakh equity share capital is increased. How much is preference share capital decreasing by? Minus 80. 44 lakh worth of preference share capital. I mean, totally capital is decreasing by 44. I have to create CRR for 44. How much is the equity share capital increasing by? 36. How much is preference share capital decreasing by? 80. Total decrease 44. I have to create CRR to the extent of 44. Everybody understood? 44. From where do I create? From our reserves. Which reserve do we have? General reserve? Yes. Sir, can I use CRR to create CRR? You cannot use CRR to create CRR. Sir, can I use security premium? No. You can only use two. General reserve, P&L account. You should use pre-reserves. What should you use? General reserve, how much is available? Yeah. Shall I use it? How much will I use? 44. Credit capital redemption reserve, 44 lakh. Got this? One mistake that you might end up doing, which I want you to be cautious, don't consider this increase in preference share capital anywhere. Don't tell, sir, preference share capital is also increasing by 20. Don't consider. Equity shares issued by way of right, we are collecting 44. Preference share capital decrease 80. Net decrease, sorry, 36 equity share capital increase, 80 preference share capital decrease, net decrease 44. Create CRR for 44 lakh only. Got this? Don't consider this 20 lakh anyway. Done. So you can alternatively next year do one more thing. What can you do next year? This is not required. You can make that share call for right shares. If you make, you will write equity share call to equity share capital. How much is it? 40 rupees. For how many shares? 60,000 shares. 60,000 into 40. 2 lakh, 24 lakh, 24 lakh. This is not needed. Is this needed in the answer? No. Will this impact balance sheet? No. Shall I prepare balance sheet notes to accounts? They're not asking full balance sheet. They're only asking for two things. One, share capital. Two, reserves and surplus. Share capital, note number 1. Authorized capital needs to be written, which we don't know. Yeah. Now, how to prepare balance sheet? Very easy. Start from here. How much is this year? 80,000, 10% preference share capital, 100 is 75 paid up. 60 lakh. Take 60 lakh in your calculator, everyone. This has actually been redeemed. It will become 0, but I'll show it to you mathematically. Do you have 60,000 in 60 lakh in your calculator? Come to the entries. First entry, do you have preference share capital anywhere? Second entry, third entry, fourth, fifth. Yes. Credit 20, add 20 there. Capital has increased by 20. How much did it become? Debit 80 lakh minus 80, 0. Will it come in balance sheet? But remember to write 10% preference share capital, 60 lakh. That's what you started with in your calculator. Added, final call, 20 lakh. How much did it become? 80 lakh. Then I did redemption, 80 lakh. That is the reason it will appear as 0. Are you getting it? Next, what do we have after that? 2 lakh equity shares of rupees 100 each, fully paid up. 2 crore. Take 2 crore in your calculator. 2 crore in your calculator. Then come here. First entry, is there equity share capital? No. Second entry, yes, 15 lakh. Add 15 lakh. Third entry, again there is 21 lakh. Add 21 lakh. That's it. Call is not made. What do you have in the calculator? 2 crore I would write equity share capital 2 crore 36 lakh. Am I right? I would write that 2 crore separately, 36 lakh separately. Why? 2 crore is 2 lakh shares of rupees 100 each fully paid up. And that 36 is 60,000 shares of rupees 100 each, against which we collected only application and allotment. We have not made call. Only 60 rupees is collected. 40 rupees is not collected. Only 60 is collected. 40 is not collected. It will be written as 60,000 shares of rupees 100 each, paid up 60 each. Say something. So I would write 2 crore 36 as the total of share capital which will appear in my balance sheet. Done. Notes to accounts for share capital. Now let's do notes to accounts for reserves and surplus. What reserves and surplus are there in the balance sheet? Security premium 6 lakh 50. Take your calculator, type 6 lakh 50. Did you type? Come to entries. First entry, do you have security premium? Second entry, third entry, third entry, ಇದೆ 6 lakh. Add. Did you use it here? No. Here? No. Here? No. 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 How much is the amount? I would write here security premium. How much was it? 6 lakh 50. How much did we add? 6 lakh. It became 12 lakh 50. Got this? What do we have after this? Capital redemption reserve. It's a 15 mark question. Take capital redemption reserve 42 lakh in your calculator. Done. Come to the journal entry. First journal entry. Do you have CRR? Second entry. Third entry. Fourth entry. Fifth. No. Sixth. No. Seventh. No. Eighth. No. Ninth. No. 10th. Last entry of 44 lakh. Additionally CRR created. Add 44 lakh. How much do we get? 86 lakh. I would write here capital redemption reserve. It was there 42. You created 44. It became 86. Okay. What's after? You have general reserve. How much? 85. Take 85 in calculator. You have it in first entry. Second, no. Third, no. Fourth, no. Fifth, no. Sixth, no. Seventh, no. Eighth, ninth also it's not there. Last entry. 44 lakh is deducted. Why? From general reserve only we created CRR. 40. I would write here general reserve. It was there to the extent of 85. We've created that premium paid is there, no? It should be deducted from P&L. We don't have P&L anywhere here. We have P&L anywhere here? No. So in the accounting entries, this premium on redemption, I've transferred no P&L. I've deducted from general reserve because P&L is not there. Because P&L is not there. Sir, can I assume because P&L reserve is not there, premium cannot be paid, so redemption not possible, so right issue not needed, so question is irrelevant. They'll tell you are also not needed in C enter, I will also not give you 15 marks. Assume that is this. Or you can write negative P&L, but don't do that. I will deduct 4 lakh from that only. Is it okay? So deduct 4 lakh here. But usually if P&L is available, from where do we deduct? P&L only. Do 85 lakh minus 4 lakh minus 44 lakh. 30. Got this general reserve? Anything else in the balance sheet? No. Check in the journal entries if you have something new, capital or reserve. Bank account will go to asset side. We are not doing. Don't worry. Equity share application, credit 15 lakh. Equity share application, debit 15 lakh. Damar. Share allotment, debit 27 lakh, credit 27 lakh. Damar. Bank account will go to asset side. Then preference share call 20, preference share call 20. Credit debit will go. Bank account 2 lakh, will add everything and write in balance sheet asset side. They've asked us to do balance sheet only share capital and reserves and surplus. Then premium on redemption, debit 4 lakh, premium on redemption, credit 4 lakh. Gone. Preference shareholders, credit 84 lakh, preference shareholders, debit 84 lakh. Gone. Bank balance, asset side. Then anything left? Nothing left. So that's it. How much is the total of reserves here? 12 lakh 50 plus 86 lakh plus 37 lakh. 1 crore 35 lakh 50,000. I would write 1 crore 35 lakh 50,000 in the balance sheet on the liability side, reserves and surplus. Don't even total. Just leave it like that. Why? It's an abstract. It's an extract. Abstract art. Randomly things are written. There's nothing there. Done. 15 marks done. 120 marks is done so far. We'll do the last 5 marks. What is the question? What are the advantages of subsidiary books? We discussed. If one person has to write, everything will be written in the same book. All the transactions has to wait. If that person does too many things, he might not be expert at it. If I have to inspect it, passing the entries will get stopped. So the advantages of subsidiary books is division of work, experience, expertise, labor. I'm going to say, what else should you say? Yeah, savings in cost will happen. Inspection can happen. Efficiency will increase. We discussed same thing. What is it? Division of work, specialization and efficiency, savings in time, availability of information, and facility in checking. I can check one book and the other can be still maintained. So these are the advantages of subsidiary. What is it? You can divide the work among many people. One of them, if they continuously do sales book, one of them, if they continuously do purchase book, they become expert at it. Because multiple books are there, multiple people enter at the same time. You can save time. If not, only one person has to do everything. Availability of information. I can get one information at one place. If not, I need to check one book only for everything. It will take too much time. And facility in checking. When I'm checking one book, in the other book's entries will can simultaneously go. I can inspect records with much of ease. This is the advantage of subsidiary books, and by this we complete our June 2024 examination paper. Hope you'll do well in your upcoming exams also. Stay in the game.
How is your examination preparation going? Have you done the RTP for January 2026 examination? If not, here's your go-to video. And in this video, I have not just discussed the answers. I have not just the topics to the extent given in the RTP, but I've gone little beyond the question. I've told you all the concepts that will come around the question to just not let you do RTP, but also do those topics around the RTP to help you do slightly better in the upcoming examinations. If you have not done RTP, this is the video in which I will not solve and you will not watch the video, but you can take your paper, pen, calculator, sit with me, and as I solve the entire RTP, you can solve it with me, and trust me, at the end of this video, you would feel much better and much confident with regard to your accounting preparation for your upcoming examinations. I wish you all the success in the examination. I wish you everything that you deserve. In fact, an exemption in accounts and a rank in CA Foundation. Let me know in the comments later if in case this examination and this result goes in your favor. We'll be hoping to see you all in your CA intermediate at the end of this RTP discussion and at the end of your CA Foundation examination. Why waste time? Grab your paper, grab your pen, keep that calculator next to you, and let's start with RTP discussion for January 2026 examination of CA Foundation Accounting. Let's now discuss question number 1, true or false, from our RTP January 2026 for CA Foundation Accounting. The very first question is the concept of conservatism when applied to balance sheet results in understatement of assets. Slightly a twisted question. Firstly, conservatism convention is applied to P&L, basically expenses and incomes. It says that we need to account for all expected expenses and losses, but not for expected incomes and gains. If this is applied to balance sheet, assets will be understated and liabilities will be overstated, but that is if you are not prudent. The objective of conservatism is not to understate assets. The objective of conservatism is to show the assets at right value, but accounting for expenses by anticipating and not accounting for incomes by anticipating. So you can comfortably write the answer as false, not quoting conservatism as a reason, but you would have to quote the word prudence. If in case we are prudent, then assets will not be understated in spite of conservatism. Then Messrs. Raj, Yog and company runs a cafe. Congratulations to them. Hope you serve really good coffee. They renovated some of the old cabins. Because of this renovation, some space was made free and number of cabins increased from 25 to 28. Total expenditure is 50,000. It was treated as revenue expenditure. They're trying to bring in a case study kind of scenario in a true or false question, but this is quite simple. You understand that number of cabins increased from 25 to 28. So the utility has increased. Future economic benefit can be seen from this. And the amount of cost that will be incurred on renovation is quite huge. Material amount of money is gone in. And you won't do this renovation every year or every month or every 2 years. So this expenditure of 50,000 incurred on renovation, it is not revenue expenditure. It is capital. We've learned this, how to segregate some expenditure into capital and revenue based on the nature of the business, basis of the expenditure, purpose for which it is incurred, recoverability, revenue generation capability, and materiality. In this case, that increase in the number of cabin numbers will give us future economic benefit. Amount incurred is material, and we won't do this expense again and again. So I will comfortably call this expenditure as capital expense and not revenue expense. So the answer is false. Bank reconciliation statement is prepared to arrive at bank balance. No, false. Bank reconciliation statement is prepared to identify the errors, if any, between passbook and cash book, so that we can rectify those errors in my cash book. And if the error is in passbook, I can only request them to change, but I can't make entries in banker's books. I'll repeat, the objective of preparation of bank reconciliation statement is not to find bank balance, or it is not to find cash balance. Cash balance, bank balance, both are known. We compare them to see differences, to check if any of those differences are arising because of errors. If there are errors, we will rectify them in our cash book. I hope you got it. So the answer is false. The provision for bad debts is debited to Sunday debtors account. No. Provision for bad debts is not debited to Sunday debtors account. Provision for bad debts is debited to P&L, and it's a provision to be recorded in the balance sheet on the liability side. However, as a matter of presentation, I will show this provision for doubtful debts as a reduction from my debtors. But there is no journal entry between provision and debtors. It's a liability created by debiting P&L, and it is shown in the balance sheet as a reduction from debtors. It is provision created for the anticipated non-recovery from some of our customers. Depreciation is a non-cash expense. Finally, we have one for which the answer is true. Depreciation is a non-cash expense and does not result in any cash outflow. 100% correct. Question number E, the answer is true. Depreciation is a non-cash expenditure. It doesn't result in any outflow of cash. Discount at the time of retirement of a bill is gain to the drawee. Okay. Discount at the time of retirement. What do you mean by retirement? I have sold the goods, you have purchased the goods, I have drawn a bill, you have accepted the bill. I become drawer and seller, you become buyer and drawee. Let's say you are supposed to pay me money after 2 months. After 1 month, you have the money ready, you offer to pay the money to me. Let's say you were supposed to pay the money after 2 months, and at the end of 1 month you have money and you're willing to pay. I was supposed to collect money from you after 2 months. If I'm collecting the money from you after 1 month, I'm happy to collect because I'm receiving the money early. And this is called retirement. Retirement is where the bill is settled before the maturity date. Maturity and due is in the next month. You're paying the money to me this month. That early payment is retirement, and I'm happy about it. I offer you discount. To me, discount is expense. I am drawer and seller. To you, drawee, discount is received. You receive discount on retirement because you are a good person. Such a good person you are. You paying the money to me well before the maturity date. I give you discount. To me, it's expense. To you, it's income. You are drawee. You are buyer. To you, it is gain. Answer is true. Next, provision for discount on creditors is often not provided keeping in mind principle of conservatism. If I owe money to somebody and if I supposed to pay them money, I won't create provision for discount. Like I am thinking or I am expecting that they will offer me discount. No. When they offer me discount, I will book income. Before they offer me discount, I won't anticipate the discount and then create provision, because the reason is conservatism. Such anticipation of discount to be received is against conservatism. I cannot account for anticipated income. On the other hand, if one of the customer is supposed to pay me money, if I expect him not to pay, if I expect to give discount to him in the future, I can create provision for discount, because conservatism says account for anticipated expenses. That is a discount that you will offer to your customer, but don't account for anticipated incomes before you receive it. If my creditor actually gives me discount, then I'll record. If I anticipate it, I'll not record. Conservatism. Answer is true. Then firm will receive surrender value of JLP on the death of a partner. Sorry, no. It's a good news that the partner has died, because the JLP will mature and will receive full policy amount and not surrender value. Joint life policy is a policy taken on the lives of all the partners jointly by the firm. In the case of death of a partner, we receive policy amount, full value. If in case of admission, retirement, dissolution of firm or dissolution of partnership, wherein we surrender the policy and we don't claim full money, we'll receive only surrender value. So on death, full value. On retirement, on dissolution, only surrender value. So here they're telling on JLP surrender, we receive, firm will receive surrender value on death. No, on death we receive full value. On death we receive full value or policy amount. Answer is false. Then we have I, where a non-profit organization separate trading activity, profit and loss shall be transferred to income and expenditure at the time of consolidation. Where a non-profit organization separate trading activity, the profit or loss from the trading shall be transferred to income and expenditure at the time of consolidation. Yeah, all the income and expenditure of not-for-profit organization, partly trading activities done, will be transferred to income and expenditure only. True. Fixed charge generally covers all the assets, including the future one. Oh, fixed charge is specific asset mentioned. Now, let's say I've given you money as loan, or you've given me debentures. Basically, I've given you loan. I, in the debenture certificate, ask you to mention your plant and machinery specifically. Meaning, if in case you don't pay me my interest, don't redeem my debentures, I can take your plant and machinery. You can't stop me. If I ask you to mention that name of plant and machinery in the debenture certificate, I have a fixed charge on your asset. If fixed charge is made, it's on a specific asset. It's not on random asset and future assets. If it is floating charge, then it covers all the assets, including the future one. If it is fixed charge, it's on the specific asset. So, J, true or false questions, the answer is false. We'll now discuss question number 2, theoretical framework based question, a theory based question from our Jan 2026 RTP. Discuss the limitations which must be kept in mind while evaluating financial statements. Financial statements, whatever we prepare, does not consider qualitative characteristics. It only considers quantitative characteristics. It might be deceiving because it has taken into consideration all the historical data. The price level changes have not been considered, inflation has not been considered, and it doesn't take into consideration the fact that accounting is biased. Different policies will result in different profits and different valuations. And another important point one to note is there can be window dressing within the financial statements. So keep in mind that financial information which is given in the financial statements ignores qualitative information. It can be biased. It is based on picking a lot of accounting policies. It can be window dressed and all of this. And those are the drawbacks also of accounting. Then distinguish between going concern and cost concept. Very simple. Going concern is the concept which is a fundamental accounting assumption, which says that whenever we do accounting, whenever we do business, it is done with the assumption that the organization neither has an intention nor a necessity to close down its operations in the near future. It always has the intention to continue the business for foreseeable future. Like if I have an asset today, I don't have an intention to sell that asset and close the business today. My intention is to use this asset till the end. I'll continue to do business next year. 31st of March, you don't expect me to sell all the assets, pay all the liabilities, and next year start afresh. That is the reason we prepare balance sheet, where we write balance of all the assets and liabilities and keep my capital also there, because I will wake up tomorrow and start my business, continue my business again, and not sell my business. So the fundamental accounting assumption of going concerns is that organization neither has an intention nor a necessity to close down its operations in the near future, or it intends to continue its business for foreseeable future. Cost concept says that all assets should be recorded at the historical cost. That is the cost at which I purchased by giving the money. And historical cost concept should be followed whenever the organization is going concern. When the organization is not a going concern, when you expect not to go further and do the business for next few years, then you need not follow cost concept. You can start following realization concept. You will start valuing your assets not at historical cost, but at realizable value. Let's now solve question number 3A from our January 2026 RTP. This question 3A is on the topic of journal entries. This is chapter 2 accounting process, unit 1 journal entries. Let's begin. You are required to pass necessary accounting entries, journal entries in the books of Mahesh. So we are representing Mahesh and we are writing entries on behalf of Mr. Mahesh. See the first transaction.
A check amounting to rupees 24,000 from Shankar is received in full settlement of his account of rupees 25,000. So the amount receivable from Shankar is 25,000, and against 25,000 receivable, we have received a check which is of 24. So receivable is 25, received is 24. We are still supposed to receive 1,000 from Shankar. In the question, it's told that it is in full settlement, meaning balance of 1,000 rupees will no longer be received, and that balance of 1,000 will become discount allowed. We are Mahesh, we are receiving check from Shankar, we give discount to Shankar. So the entry will be, when we receive the check, I will debit my bank account to the extent of 24, and Shankar is my asset because he is giving me the money. Asset is reducing, I will credit my asset Shankar by 25. 1,000 rupees which I'm not receiving but I'm still writing off will be recorded as discount allowed. So the journal entry is bank account debit, discount allowed account debit to Shankar. Let's go to the next journal entry. Withdrawn for personal use goods of sale price 9,000 which are of cost 6,000 and cash is 3,000. Whenever the goods are issued other than by way of sale, we cannot credit sale account. We will be crediting purchase account to represent the goods that are going out. And whenever the goods are being withdrawn for personal use, it is drawings, and drawings will decrease capital. Whenever the capital decreases, capital account should be debited. In fact, we'll be debiting drawings account. The journal entry will be drawings account debit to purchase. This drawings account debit to purchase is for the goods purchased, and this entry should be passed at cost price. However, cash is also withdrawn to the extent of 3. So my drawings is not 9,000 sale price of inventory. My drawings will be 6,000 which is cost. It is not 9, it is 6,000 cost. Along with that, I'll add cash of 3,000 which is withdrawn. That makes my drawings 9,000. So drawings which is decreasing the capital is 6 plus 3, 9,000. Out of that, 3,000 is cash going out, so you should credit cash. 6,000 is inventory decreasing, so we will credit purchases by 6,000. The journal entry that we would have to pass will be drawings account debit to the extent of 9 and credit my purchase account representing 6,000 inventory flowing out and 3,000 credit cash account for the cash flowing out. So this is the journal entry for goods and cash withdrawn for personal use. Let's go to third one. Third one, goods costing rupees 3,000 are distributed as free samples. See, this is again, sale is not happening, but the inventory is going out. Whenever there is flowing out of inventory other than by way of sale, we cannot credit sale. Should be always crediting purchase. When the goods are given away as free sample, when the goods are withdrawn for personal use, when the goods are used for construction of an asset, in all of these cases, we will not be crediting sales. In fact, we will be crediting purchase. An important point to note when we credit purchase is, whenever we credit purchase, it should be at cost price. It cannot be at selling price. Whenever we credit inventory, it should be at cost price. That is purchase account credit at cost price, not at sale price or invoice price. Let's write an entry to this. Free samples given away as advertisement expenditure. So the journal entry will be advertisement expense account debit to purchase account. This is to the extent of 3,000 rupees. Understood? Let's go to the fourth one. Fourth one is received commission of 15,000. Commission is income. Income has to be credited. And when I receive commission, it is received in the form of cash. So cash account has to be debited. Commission account has to be credited. Journal entry will be cash account debit to commission account. Point to be noted is half of this does not relate to current year. Out of 15,000, half, which is 7,500, it doesn't relate to current year. It is received in advance for the next year. So when I debit my cash account for 15,000 rupees, I will credit commission account for 7,500. Balance 7,500, which is not my current year income, will not be credited to commission account, but it is income received in advance to be credited to commission received in advance, pre-received income account. So the journal entry will be bank account or cash account debit 15 to commission income 7,500. Another 7,500 is credited to advance commission account. Alternatively, you can split this entry into two. You can write cash account debit to commission income 15,000, 15,000, and then write commission income account debit 7,500 to advance commission account 7,500. If you combine those two entries into one, it will end up being cash account debit 15 credit commission income by 7,500 and balance 7,500 credit to advance commission. Anyways, it's absolutely the same. Let's see the next one. Fifth one, income tax liability of proprietor. This is not the income tax of the business. This is income tax of the proprietor. It is proprietor's personal expense, which is to be paid by proprietor personally out of his personal cash. But proprietor's personal cash is not used to pay this. It is paid out of the petty cash of the business. So it is personal expense paid by the proprietor using petty cash of the business. If the petty cash of the business is used to pay proprietor's personal expense, this is drawings, but it is shown to you like it is income tax paid. Ignore the word income tax there. Write the entry as if 18,500 is withdrawn by proprietor for his personal use. Journal entry will be drawings account debit to cash. Drawings debit because it's reducing your capital to the extent of 18,500. Credit your petty cash because petty cash balance is reducing by 18,500. This is the journal entry that you would have to pass whenever cash of the business in the form of petty cash is used to pay income tax expense of the proprietor. Let's now go to sixth one. Sixth one, purchase of goods from Sunny of the list price 15,000. He allowed 10% trade discount. See, let's say 15,000 is the purchase of the goods. Journal entry is purchase account debit, not to cash, purchase account debit to Sunny. But just before we buy it from Sunny, we ask Sunny, Sunny, can you please offer us discount? Sunny actually offered us discount of 10%. So on 15,000, when we've been allowed 10% discount, don't you think we pay 1,500 less than 15,000? We haven't paid. Don't you think we should pay 1,500 less than 15,000? So out of 15,000, if we've been allowed 10% discount, we have to actually pay 13,500 to Sunny. So our creditors, Sunny, is only 13,500. And the inventory purchase should also be recorded not at 15, but at 13,500. So the journal entry is purchase account debit 13,500 to Sunny 13,500. We should not record discount 1,500 separately because this is trade discount. It should be recorded as adjustment from our purchase value, but not as a separate income. Purchase account debit to Sunny 13,500. Continuation of this, 200 rupees discount was also given for quick payment. I'm supposed to pay Sunny 13,500. I paid him 13,500, but because I paid it to him quickly, before the end of the credit period, Sunny offered me discount of 200. When Sunny offers me discount of 200, that 200 rupees discount what Sunny offers is expense to Sunny and it is income to me. I won't pay 13,500. I'll pay 13,300. But my liability towards Sunny will decrease by 13,500. Liability decrease, debit will be 13,500. Bank account credit or cash account credit to the extent paid 13,300. 200, what I don't have to pay, but still my liability would decrease, would become my discount received income. So the journal entry is Sunny account debit 13,500 to discount received 200 to cash account 13,300. And this marks the end of all the 6 questions which is there on 3A, which is journal entry based question. Taking this slightly forward, let's now solve question 3B, which is on capital or revenue expenditure. Following expenses or following payments have been basically made. We need to classify them into whether it is capital payment or capital receipt or revenue payment or revenue receipt. Before we classify this 1, 2, 3, 4, 5 items, let me tell you why do we do this. We do this because the treatment of capital payments is much different from how you treat revenue payments. Revenue payments are expenses which will end up in P&L account and trading account, whereas capital payments are assets which will end up in balance sheet. And the basis for categorizing any payment as capital or revenue is nature of business, purpose for which it is incurred, revenue generation capability of that expense, materiality, as well as recurability. Based on these 5 factors, we'll decide whether it is capital or it is revenue. Let's begin. Legal fees on acquisition of land. Whenever you incur expenditure for buying a land and the documents, whatever you got of the land, you run it through a lawyer before you buy to ensure whether the papers are correct or not. Such expenditure will not be written to P&L account. It will be added to the cost of the land. So this is capital payment and not revenue payment. Similarly, if we completely repaint an existing building, that repainting that we do will not increase the size of the building. That will not increase the efficiency or useful life of the building. It will only make the building look good. Moreover, painting is not done 1 in 20 years or 1 in 30 years. It's recurring expenditure. You might end up painting the building every year or every 2 years. So because you do it very often, it is not capital payment, it is revenue payment. Recurring amount involved is immaterial, it will not give you long-term benefit. 3 reasons. Repainting of delivery van, exactly same reason what we discussed for repainting of existing building. Revenue payment. What is the reason? Very simple. When you paint the van, the size of the van will not increase. Van's useful life or efficiency will not increase. You paint it so that it looks good. And painting is not done once in 15-20 years. You might end up painting it very often. So repainting, because it is immaterial amount involved, it will not increase the revenue generation capability. It will not ensure future economic benefit from the asset. This repainting of the delivery van expenditure ends up being revenue payment. Then drainage drainage for a new piece of water extraction equipment. Basically, we put one borewell to extract the water from underground. When we extract that water is very hard, can't be used. We put one water filter. In this water filter, hard water goes through and comes out as usable water. Some amount of water will be thrown out as wastage. That water has to go. You cannot let it spread all over the floor. So we make one drainage. Drainage is properly built as a construction. You might put a pipe, you might dig the ground, you might put cement, you might put brick. It's a proper construction done. And this is going to give you long-term benefit. Material, money amount involved is also material. So purpose is long-term. It will give you future economic benefit. That will become a capital payment. It is almost like a new asset constructed. Lastly, we have carriage cost for replacement part of a piece of machinery. This is a slightly tricky one. Whenever you have an existing machinery and in that machinery one small part is stopped working, you buy a new part to replace. Firstly, this part, whatever you're buying to replace in the machinery, what is this part? Is this part very important? Is this part expenditure capitalized by adding it to the cost of the asset, or are we writing this part to P&L? That's the question. If we're writing this part to P&L, it is like ignorable repair expenditure. Then transportation cost also will be written to P&L. That is revenue. If the part that is replaced in the asset is revenue, then the transportation or carriage cost is also revenue. However, if the part is of capital in nature and to be added to the cost of the asset, then the transportation cost also will be added to the cost of the asset. They have not told that replacing that part will increase the efficiency of the asset. Because they have not mentioned that it will increase the efficiency, I will treat that repair part as well as the carriage expenditure on that repair part both as revenue payment. Alternative assumption is valid, but they have not told that it will increase the efficiency. So revenue payment would be the ideal answer. Let's do question number 4A from our January 2026 RTP. This question 4A is from accounting process chapters, but it is from the unit of subsidiary books. They want us to do sales book. Interesting. Easy one. Let's start. Sales book of Mr. Kabir of Almora for January 2025. Important point to note before you start any question on sales book. Remember, what we record in sales book is sale of inventory, not sale of assets. Important checkpoint. In order to record it in sales book, it should be sale of inventory. It should not be sale of asset. Point number 2. It should be sale of inventory on credit. It should not be for cash. If it is on credit and if it is of inventory, you record it in sales book. If it is goods sold for cash or if it is sold on credit but it is asset, we will not record it in sales book. 2 checkpoints. Number 1, inventory. Number 2, credit. Start. January 5th. What happened on January 5th? Sold to Messrs. ABC 10 pieces of chairs at rupees 5,000 each, less trade discount of 5%. So I have sold goods to ABC. They have not mentioned cash, so I'll assume it to be credit. Because we've learned, no, unless they mention cash, it's not cash. And they mention the name of the party, then it will become credit. So I've sold it to ABC, 10 chairs into 5,000, 50,000 rupees, but that's not the sale amount. I've offered them 5% discount. So in my sales book, I would write 5th of Jan is the date of transaction. Messrs. ABC, 10 pieces of chairs into 5,000 rupees for chair. This comes to be 50,000 rupees. From this, I'll deduct trade discount of 5%, which is 2,500. From 50,000, if I deduct 2,500, it ends up being 47,500 rupees. This is the sale entry. Let's go to the next one. On January 12th, we sold to Messrs PQR 25 pieces of tables at rupees 2000 each, less trade discount of 10%. Again, I am a furniture shop. When I sell table, it is inventory sold. They have not mentioned cash, so it is credit, and I'm offering discount of 10%. So I would write on January 12th, Messrs PQR. I'll write 25 pieces of table into rupees 2000 per table, which comes to 50,000. From this, I'll deduct trade discount at 10%, 5,000. I'll end up getting 45,000 rupees as the credit sale entry in our sales. After this, let's go to third one. January 18th, sold goods to Messrs MTB. That's the name of our creditor to whom I've sold. I've sold 5 pieces of recliner chairs. This is also furniture. And each chair is sold at rupees 11,000. 5 into 11, 55,000 will become sale. But wait, there is trade discount of 10%. We will deduct trade discount. But what's very important is payment is received through check. If I receive the payment instantly through check, this is goods sold for cash. Sir, but check is received. Whether you receive check or you receive cash, it is goods sold for cash. Instantly, if you receive money, it is cash sale. Not necessarily it has to be for cash. This is not credit sale. Meaning settlement is made immediate. Settlement in cash is not postponed to another date. Because the settlement in cash is immediate, this entry will be recorded in cash book, and in my sales book, I would make no entry. Why is it that I make no entry against this January 18th transaction? Because the inventory is sold. 5 chairs, 11,000, 10% trade discount. But check is received instantly. Because the settlement is instant, this would not appear in sales book. Instead, this transaction would go to cash book. After January 18th, January 28th, we sold goods to LMN. What did we sell? 50 pieces of cupboards at rupees 10,000 each. Each cupboard is sold for 10,000 and we sold 50 pieces. Do 50 into 10,000. That will come to 5 lakh rupees. That is a sale. And I've offered discount of 20%. So I'll do 50 into 10,000, 5 lakh minus 20%. That would be the sale. In my sales book, I would write January 28th, Messrs LMN. 50 cupboards into 10,000 per cupboard, that becomes 5 lakh. I will deduct trade discount at 20%, which comes to be 1 lakh. From 5 lakh, if I deduct 1 lakh rupees as trade discount, 4 lakh rupees will be the sale made to LMN. Is there any more transactions? No. Just simply take the total 47,500 plus 45 plus 4 lakh, which becomes 4 lakh 92,500 is the total sales made on credit in the month of January by Messrs Kabir. Let's now start with question 4B from our January 2026 RTP. This question is on chapter 2 accounting process last unit, which deals with rectification of errors. Let's begin. Mr. Lalit was unable to agree the trial balance of last year. So this transaction or these errors have been happening, basically happened in the previous year. So errors which has happened in the last year have been identified this year. If you identify the previous year errors in the current year, the rectification can be done in the current year. But remember, this is stage 3 rectification. Rectification after final accounts. When you rectify the errors after final accounts, your rectification entry cannot involve items affecting profit and loss account. Your rectification entry cannot involve items affecting profit and loss account. Meaning, rectification entry cannot involve purchase account, sales account, purchase return account, sales return account, expense account, and income account. These accounts cannot be written in rectification entry. These have to be replaced with profit and loss adjustment account. That's one point. Another point to notice, at the end of the year, after you rectify all the errors, you close profit and loss adjustment account by transfer to capital account. Should close your profit and loss adjustment account by transferring the entire balance to capital account. Is it compulsory? 100% compulsory. If you don't write this entry, your marks will be cut. So please ensure that you write this closing entry also. Next, and wrote off the difference to P&L. This is the first mistake that they did. Whenever the trial balance doesn't tally, you should write the difference to suspense, but they by mistake written it to P&L. Whenever they write the difference in trial balance to P&L, when we rectify, whenever we use suspense, suspense is not getting cleared. Suspense is getting created. So after you rectify all the errors, at the end, suspense account also should be closed by transfer to capital. Because in the past, if they had credited or debited suspense when trial balance didn't tally, every time we pass rectification entry, suspense will get cleared. But if they didn't use suspense, if they wrote P&L, amount what should have been otherwise been there in suspense has now affected profit, profit has affected capital, capital is wrong. So to rectify the capital, whenever we pass rectification entry using suspense, the total amount that is there in suspense will be transferred to capital and the capital will become corrected. So in this case, you need to remember three important points before you solve the problem. Point number one, because this is rectification after final accounts, in the rectification entry, you have to ensure that you don't use purchase, sale, purchase return, sales return, expense, income account. All nominal accounts cannot be used. It will be replaced with P&L adjustment. Point number one. Point number two, whenever you finish rectifying all the entries, you need to close profit and loss adjustment account by transferring the balance to capital account. Point number two. Point number three, when the trial balance did not tally, they should have returned the difference to suspense, but they've returned to P&L, because of which capital has gone wrong. So now we need to pass all the journal entries for rectifying at the end, identifying the total balance in suspense, and total balance in suspense also should be transferred to capital. These are the three important points to be noted when we're doing rectification for this. And they told on verifying the old books by a chartered accountant next year, the following mistakes were found. Let's rectify one after the other. First one, purchase account was undercast by 16. Purchase is expense. Basically, it's undercast. They've reduced the purchase. What do we do? Increase it. How do I record my purchases? Debit it. So journal entry is very simple. Purchase account debit to suspense. It is one-sided error. Error is only in purchase. Don't assume that there is error in creditors. Have they mentioned that there is error in creditors? No. So the error is only in purchase. Journal entry is purchase account debit to suspense. But we all know we can't debit purchase account. Why? This is error identified after final accounts. So instead of purchase, I will debit P&L adjustment. I'll anyways credit my suspense as usual. This is the journal entry for rectifying. Purchases was undercast, so I will increase. Entry is purchase to suspense. Purchase is later replaced with P&L adjustment. Got it? Next, sale of goods to Messrs. Rashmi for rupees 5,000 was omitted to be recorded. You sold goods to Rashmi, you forgotten to record it. What to do now? Record that sale entry. What is the journal entry for sale? Debtor account debit to sale. Here the journal entry is Rashmi account debit to sales. Rashmi account, okay, but sales account cannot be credited. Can I credit sales? I would have credited in another case. Because this is rectification of error after final accounts, I cannot credit sales. Rashmi account debit 5. Sales I cannot credit 5. So in the place of sales, what should I be writing? I should replace 5,000 sales with profit and loss adjustment account. I'll replace it with profit and loss adjustment account. So this is sales entry which was previously omitted, now recorded. Let's go to third one. Receipt of cash from Mr. Ashok. Stop here. First think, what is the entry that you should have passed when you receive cash from Ashok? Cash account debit to Ashok account. The journal entry is cash account debit to Ashok. This was posted to the account of Mr. Anubhav. Instead of crediting Ashok, they've wrongly credited Anubhav. Should you credit Anubhav? No. What have you done? You wrongly credited Anubhav. Because Anubhav is wrongly credited, now you should replace it by debiting Anubhav. Once you debit Anubhav, Anubhav account is corrected. But when you received cash from Ashok, Ashok was supposed to be credited. Ashok is not credited. Now you credit Ashok. Anubhav was wrongly credited. To reverse the credit, Anubhav should be debited. Journal entry will be Anubhav account debit to Ashok account 1200, 1200. And in this case, in this journal entry, there is no nominal account involved. You don't have to replace neither Anubhav nor Ashok with P&L adjustment. Entry will remain as Anubhav to Ashok. Anubhav, who was wrongly credited, is now debited. Ashok, who was supposed to be credited, is now credited. End of the story. Entry is Anubhav account debit to Ashok account 1200, 1200. Next, let's go to the fourth one. Amount of rupees 4,167 of sales was wrongly posted as 4,617. What is the problem? Sales is 4,167. It's been wrongly recorded as 4,617. We recorded sales by a higher amount. What should I do? I should reduce the sales. Sales, when you credit, it will increase. To decrease it, you should debit it. So I should debit my sales account. I would have to debit sales, but I know it, you know it, we all know it. Sales account should not be debited by 450. That is 4617 is the wrong amount. 4167 is the correct amount. It is increased by 450. To decrease it, I should debit. But I cannot use sales in rectification after final accounts. I'll replace sales account with P&L adjustment 450. Credit will be suspensed. There is no error in debtors account. The problem is only with sales. So only sales I'll reduce 450. After this fourth one, let's go to fifth one. There is repairs to machinery. How much is repairs to machinery? 6,100 was debited to machines. Repair is expenditure, revenue in nature. It should have been debited to PL. Instead, incorrectly, they've added it to the cost of the machine. Revenue expenditure incorrectly treated as capital expenditure. So, principal error, which needs to be rectified. Machinery was wrongly debited by 6,100. I should reduce the machinery by crediting machinery by 6,100. Then what is the correct debit? Repair expense is the correct debit. 6,100 being repair expenditure should have been debited to repairs, but have not debited to repairs. Because repair expenditure of 6,100 is not debited to repairs, I will debit now. Machinery which was wrongly debited by 6,100, I will credit. Repairs which was supposed to be debited but not debited, we will now debit. Entry will be repair account debit 6,100 to machinery account 6,100. But did the bulb glow? We cannot debit repairs. Why? Very simple. It is error rectified after final accounts. Can't use nominal account like repairs. Nominal account will be replaced with profit and loss adjustment account. Entry will be repairs account debit 6,100, which is now replaced with P&L adjustment account 6,100 to machinery account 6,100. This is the entry for fifth one. Got it? Then let's see what's the sixth one. Sixth one is the last one. Yeah. A credit purchase of goods from Mr. David for rupees 3,000 is entered as sale. I purchased goods from David. Journal entry should have been purchase account debit to David. What have I done? I have wrongly recorded as sales. I have written David to sales. David to sales should not be written, but it is written. I should reverse it. In order to reverse it, I should debit sales, credit David. Purchase to David is not written. To record it, I should record purchase account debit. I should record David account credit. I'll repeat. It is actually purchase, for which the journal entry is purchase account debit to David. But I've wrongly written it as David account debit to sales. David to sales is wrong entry. Reverse it. Debit sales, credit David. Next, purchase is not recorded, no? So debit purchase, credit David. Journal entry will be sales which is incorrectly credited to be reversed, debit sales. Purchase which is supposed to be debited, not debited, debit purchase. Credit David by double the amount, 6,000. So entry is purchase account debit, sales account debit to David. Purchase account debit, sales account debit to David. 3, 3 and then 6. But we all know it, we cannot use purchase account and sales account in rectification entry in this question because here error is being rectified after final accounts. So I'll replace sales and purchase with profit and loss adjustment account 6,000. So the journal entry will become profit and loss adjustment account debit 6,000 to David account 6,000 being purchase of goods wrongly entered as sales, now rectified. By this, I have covered all the 6 errors. Now, they're asking us to suggest rectification entries, which we did. Only first point is covered in so far what we've done. Other 2 points you have to remember. We've replaced nominal accounts with P&L adjustment, but we have to close P&L adjustment account by transfer to capital. Let's do that. P&L adjustment account debit 16. Take that in your calculator. P&L adjustment account credit 5. 16 minus 5. It will become 11. It will become 11. Then you again debit P&L adjustment account by 450 plus 450. And then you will do again plus 6,100. Then you will do plus 6,000. There are too many debits. Total of the debit minus that one credit item is how much? 16,000 minus 5,000 plus 450 plus 6,100 plus 6,000. What do we have? 23,550. That is the balance that is left in P&L adjustment as positive. I will credit it and debit my capital account. Whose capital account? The name of the person who's doing the business is Lalit. So it will be debited to Lalit's capital account. This is a closing entry. This has to be written. Mandatory. P&L adjustment account balance closed by transfer to capital. If you have not done P&L adjustment, that would have affected your PL. It would have bothered your profit, which is not correct. So you have to route it through P&L adjustment into capital account. First point done. Second one, this last entry is actually not needed if they would have written the difference in trial balance to suspense. But when the trial balance did not tally last year, they've incorrectly written it to profit and loss. So we'd have to close suspense account also, exactly like how we close P&L and transfer it to capital. Let's do it. First entry, we have suspense credit 16,000. Take minus 16. Next entry, we don't have suspense. Third entry, we don't have suspense. Fourth entry, we have suspense 450. So minus 16,000 minus 450. It becomes minus 16,450. Then we don't have suspense here. We don't have suspense here. That's it. Minus 16,450. We have credit of 16,450. It will be closed by debiting 16,450 to suspense account. Credit Lalit's capital account 16,450. This is how you do rectification of errors for errors identified after final accounts, where previously the difference in trial balance was incorrectly transferred to P&L. Let's now solve question number 5 from our January 2026 RTP of CA Foundation. This question is from your favorite chapter, bank reconciliation statement. But what they've asked is not something that you like. They've not asked only bank reconciliation statement. They've asked you to do amended cash book and then follow it up with cash flow statement. I think so. Yeah. Arun, have a look at the question. According to the cash book of Arun, the balance is 8,90,000. This is balance as per cash book. This is as on 30th of June 2025. They've investigated. They've identified 1, 2, 3, 4, 5, 6, 7 items. You are required to first make the appropriate adjustment in cash book. Basically, adjusted cash book or amended cash book is being required. In adjusted cash book or amended cash book, you write errors identified in cash book. You will not write checks issued but not cleared, checks deposited but not cleared. You don't write them. You will write everything else. Payment recorded in passbook only, or auto payment recorded in passbook only, or cash collected directly by the bank recorded in passbook only, interest recorded in passbook only, bank charges recorded in passbook only. All of these transactions which are not recorded in cash book are all errors in cash book. Errors of omission, errors of complete omission. These have to be recorded in cash book. Once you record them in the cash book, then the cash book balance is adjusted to find the correct balance. Once we find the corrected cash book balance, then that will be taken forward into our bank reconciliation statement. There we write these checks issued but not cleared, checks deposited but not cleared, and prepare our BRS to find balance as per past. That's what they've asked. Okay. Don't ever try to finish amended cash book first and then start BRS. Start simultaneously. Do amended cash book as well as BRS simultaneously. Keep it open. In your amended cash book, start with balance as per cash book, 8,90,000 given in the question. Write all the errors rectification here. Whatever you find as the balance carried down here, balance as per amended cash book, that will become the opening balance in BRS, and then you'll end up finding balance as per passbook here. Can we begin with 6 adjustments? The first one, checks amounting to rupees 1,20,000 issued to creditors have not been presented for payment till date. This is not an error. If it is not an error, if it is a timing difference, I'll mark it in green. It's a timing difference. This difference is arising only because of time. By time, this will get cured. Is it an error to be rectified? No. Should it go to amended cash book? No. It should go to bank reconciliation statement. The payment is being made, so the entry has happened in cash book. Cash book balance is decreased. Because the present check is not presented by the creditor, passbook balance has not decreased. Cash book balance has decreased. Passbook balance has not decreased. We're making changes in cash book. We have to add this 1,20,000. In my cash book, I would add check issued but not cleared 1,20,000. Next adjustment. Checks paid into bank 2,21,000, out of which only checks of 1,10,000 are collected by the bank up to 30th June. Again, timing difference. I have deposited 2,21,000 rupees worth of checks, because of which my cash book balance has gone up by 2,21,000. But 1,10,000 worth of checks have been cleared. Passbook has increased only by 1,10,000. Cash book has gone up by 221. Passbook has gone up by 1,10,000. There is still difference between them. How much? 1,01,000. 1,01,000 is the value of the checks which is being deposited and recorded in the cash book but not yet cleared in the passbook. So the cash book balance has increased but the passbook balance has not. We're making changes in cash book. I have to reduce 1,01,000. I would write here less. Checks deposited but not cleared, 1,11,000. Actually 1,11,000. Sorry. 2,21,000 minus 1,10,000 is 1,10,000. These two are basically the genuine timing differences which should happen in BRS. Let's see out of the other three if there are any timing difference. If there are no timing differences, if they're all errors, if they're all non-timing differences, all of them will go to amended cash book. Dividend of rupees 8,000 and rent amounting to rupees 1,20,000 received by the bank in the passbook but not recorded in cash book. See, banker has collected 8,000 rupees dividend and 20,000, 1,20,000 rent on my behalf. When the banker has collected it on my behalf, banker has recorded it in passbook and passbook balance has gone up. I have to record now in cash book. It's my income. I have not recorded. This is clearly error of omission. Passbook balance has gone up. Cash book balance has not gone up. Where are we making changes? Cash book. What should I do? Add. How much should I add? 1,20,000 as well as 8. But it is not added in BRS. It is receipt not recorded. Cash book balance has to be rectified by adding, meaning debiting on the receipt side. I mean to say on the debit side of amended cash book. In the amended cash book, on the debit I'll write dividend 8,000, rent 1,20,000, which is received but not recorded in cash book, which makes it error of complete omission. Now rectified. What's after this dividend and rent? Then I have with me insurance premium of rupees 5,400. It is being paid up to 31st December but not entered in cash book. I have given standing instructions to banker and banker has made the payment of 5,400. Unfortunately, I have not recorded this 5,400 in my cash book. That's an error. Cash book entry is not made, passbook has gone down. Making changes in cash book, we should record it as minus. But this is not timing difference. It will not go to BRS. It will go to amended cash book. In my cash book, I had to record payment, but I have not recorded, which I'll record now. In my cash book, I'll record by insurance premium 5,400 rupees, which is not recorded, is now recorded. What's after this 5,400? Then fifth one, payment side of the cash book has been undercast by 1,000. I made payment of 1,000, but I've not recorded it. I've undercasted it, meaning I've recorded it as 0. It's like payment of 1,000 not recorded, or payment is 10,000, but I've recorded it as 9,000. If I pay 10 but record 9, I've reduced the payment by 1,000. That's what has happened here. It's an error in cash book. I should have recorded that 1,000. I've not recorded. I should record now. What should I record? Payment. Simple. On the payment side, payment which was undercast will be now recorded 1,000. Then what do we have? Number 5. Bank charges 300 are shown in passbook but not entered in cash book. This is again an error of omission. Banker has charged us 300 rupees. Banker has reduced passbook balance by 300. I have not recorded in my cash book. I should now record and reduce my cash book balance. When I record and reduce my cash book balance by 300 rupees, that is an error of complete omission which is to be rectified. So the entry will not come in BRS. Entry will come in amended cash book. Which side? Payment side. I will write bank charges 300. Then bills payable of rupees 40,000 had been paid by the bank but was not entered in the cash book. And bills receivable of rupees 12,000 had been discounted with the bank at a cost of 200, which also had been not recorded in cash book. Let's do one at a time. Let's now focus on bills payable of 40, which has been paid by the bank. My banker has paid 40,000 on my behalf. So my passbook has decreased. In the cash book, I didn't record. This is an error of complete omission. I have to record 40,000 payment. That 40,000 payment, what I'll record in my cash book will be payment. It's in my amended cash book, not in BRS. In my payment side of amended cash book, I'll write bills payable 40. Then let's go forward. Bills receivable of rupees 12,000 had been discounted with the bank at a cost of 200. I have a bill with me of rupees 12,000. I went to the banker and then told banker, can you give me money immediately? Though the bill will mature later. Banker agreed to give after deducting 200 rupees discounting charges. So basically banker gave me 11,800. I have received 11,800. This has been not recorded in cash book. This is an error of complete omission. I have to record 11,800 in my PRS? No. Amended cash book? Yes. On the receipt side, I should record 12,000 minus 200, 11,800. All the entries have been done. Now identify the balance as per amended cash book, post that balance as per amended cash book to BRS, and then find the balance as per passbook in BRS. Let's do this. 8,90,000 plus 8 plus 1,20,000 plus 11,800 comes to 10,29,800. From that, you deduct 5,400, 1,000, 300 and 40,000. You will end up getting 9,83,100 as your balance carried down. Balance as per amended cash book. In your bank reconciliation statement, you start with balance as per cash book as 9,83,100. To this you add 1,20,000, deduct 1,11,000, you will get 9,92,100 as bank balance as per passbook. That's what is being asked to form. This is the answer. Amended cash book followed by BRS after amended cash book. Let's now solve question number 6 from January 2026 RTP issued by ICAI for CA Foundation Accounting. This is from our chapter 4, Valuation of Inventories. Looks like a reconciliation problem. Let's begin. Puneet closed his accounts on 31st of March each year, and without reading further, both of us know that the inventory valuation, they wanted to do it on 31st March, but for some unforeseen circumstance, situation or reason, they've done it either before or after. And using that, we have to end up finding the value of the inventory as on 31st of March. Inventory taking for the year ended 31st March 23 was completed by 10th April. So we know the value of the inventory in the Goodwill on 10th April, which is 4,50,000. Using this 4,50,000, which is my inventory value as on 10th April, I need to come backward to 31st March. Usually, any purchase of inventory or inflow of inventory is added. Any sale of inventory or outflow of inventory is deducted. That is because we are going forward. In this question, because we are coming backward, what do? Any sale of inventory will be added. Any purchase of inventory will be deducted. Remember to adjust it at cost price. Remember to adjust it at cost price. Let's begin. 4,50,000 is the inventory as on 10th April 2025. And I'm trying to find the inventory as on 31st of March 2025. Let's begin. Goods sold to customer 1,10,000. Goods sold, inventory has gone out. We're not doing forward problem. We're doing backward. If I was knowing the inventory on 20th March and finding the value as on 31st March, I would deduct it. Because I know the inventory on 10th April, I'm finding the inventory as on 31st March. The inventory was there in my godown on 31st March. In this 10 days gap, I've sold. So if I count the inventory on 10th April, it is obviously less. I need to add back the inventory sold within these 10 days to find the inventory as on 31st March. Forgetting all that simple logic, outflow, add, inflow, deduct. Because we are doing ulta, I will add cost of goods sold. Remember, should add cost of goods sold, not sales. Sales given here is 1,10,000. But I have to do two adjustments for this. If there is any sales return, first I'll deduct sales return. Then I'll find the net sales. From that, I'll eliminate the profit margin and write in the outer column. Next, I have with me sales return. It is 10,000. I would deduct from my sales of 1,10,000, sales return of 10, which will give me net sales of 1 lakh. Then purchases is 85,000, which includes cash purchase of 10. I won't care about cash purchase. Cash purchase or credit purchase. Purchase is inflow. It is earlier added. Now, because I'm removing the impact, I will deduct it. And that also will remain in the inner column. This is because I want to deduct purchase return, if any, from this and then take it out of column. And that sales less sales return is there in inner column because I need to eliminate profit element from the same. What do we have after this? Purchase return. How much is my purchase return? 2,500. I'll deduct it from my purchases. From 85, when I deduct 2,500 purchase return, it will come to 82,500. Then goods costing 20,000 received in March. Already received, it is included in March, it is included in 10th April's inventory. This is not inflow outflow adjustment. Remember that. This is a special item. For sale on consignment basis, of which 60% of the goods have been already sold. So this is not my inventory, somebody else's inventory. They've given it to me to sell for commission. So 20,000 worth of it is received. It's there in my godown, but it's not mine. As on 10th of April, 60% is sold. So how much is left in my godown? 40%. 40% of is there in my godown. When they counted physically, they counted that also. But actually that doesn't belong to me. Now I'll eliminate. How much? 40% of 20,000. Less consignment stock which is there in my godown which doesn't belong to me, which is 40% of 20,000, 8,000 rupees is deducted from my inventory. Then one last adjustment. After stock was taken, it was found that certain very old and slow moving item costing 16 should be taken at 9,500. We all know that the inventory should be valued at cost or NRV, whichever is less. Cost is 16,000, net realizable value is 9,500. When I value it at whichever is less, I would have to value it at 9,500. From 16,000, if I have to bring it down to 9,500, I have to write it down by 6,500. I will deduct 6,500 from the value of my closing stock. Then profit margin is 25% on cost. Okay, this 1 lakh is sale price. What I know is cost. If cost is 25, if profit is 25, cost is 100, selling price is cost plus profit. Sale is equal to cost plus profit. Profit 25 on cost, meaning cost 100, profit 25, sale is 125. I should do 25 by 125. Or you can use another logic where 25% on cost is 1 by 4 on cost. If it is 1 by 4 on cost, it's 1 by 5 on sale. 1 by 5 is nothing but 25 by 125. I'll deduct profit at 25 by 125 or your way 1 by 5. 25 ones are 25. 25 fives are 125. It comes to 20,000. When I deduct it, 80,000 is here. Now quickly take your calculator and do 4,50,000 plus 80,000, 5,30,000 minus 82,500 minus 8,000 minus 6,500. You will end up with 4,33,000 to be the value of inventory as on 31st of March 2025. Found keeping 10th April 2025 inventory as base. I hope you guys understood this. If you need any help on inventory or any other topic, do drop a message in the comments and I'll definitely see it and then provide you with help. Let's now solve question number 6 from January 2026 RTP issued by ICAI for CA Foundation Accounting. This is from our chapter 4, Valuation of Inventories. Looks like a reconciliation problem. Let's begin. Puneet closed his accounts on 31st of March each year, and without reading further, both of us know that the inventory valuation, they wanted to do it on 31st March, but for some unforeseen circumstance, situation or reason, they've done it either before or after. And using that, we have to end up finding the value of the inventory as on 31st of March. Inventory taking for the year ended 31st March 23 was completed by 10th April. So we know the value of the inventory in the godown on 10th April, which is 4,50,000. Using this 4,50,000, which is my inventory value as on 10th April, I need to come backward to 31st March. Usually, any purchase of inventory or inflow of inventory is added. Any sale of inventory or outflow of inventory is deducted. That is because we are going forward. In this question, because we are coming backward, what do? Any sale of inventory will be added. Any purchase of inventory will be deducted. Remember to adjust it at cost price. Remember to adjust it at cost price. Let's begin. 4,50,000 is the inventory as on 10th April 2025. And I'm trying to find the inventory as on 31st of March 2025. Let's begin. Goods sold to customer 1,10,000. Goods sold, inventory has gone out. We're not doing forward problem. We're doing backward. If I was knowing the inventory on 20th March and finding the value as on 31st March, I would deduct it. Because I know the inventory on 10th April. I'm finding the inventory as on 31st March. The inventory was there in my godown on 31st March. In this 10 days gap, I've sold. So if I count the inventory on 10th April, it is obviously less. I need to add back the inventory sold within these 10 days to find the inventory as on 31st March. Forgetting all that simple logic, outflow, add, inflow, deduct. Because we are doing ulta. I will add cost of goods sold. Remember, should add cost of goods sold, not sales. Sales given here is 1,10,000. But I have to do two adjustments for this. If there is any sales return, first I'll deduct sales return. Then I'll find the net sales. From that, I'll eliminate the profit margin and write in the outer column. Next, I have with me sales return. It is 10,000. I would deduct from my sales of 1 lakh 10, sales return of 10, which will give me net sales of 1 lakh. Then purchases is 85,000, which includes cash purchase of 10. I won't care about cash purchase. Cash purchase or credit purchase. Purchase is inflow. It is earlier added. Now, because I'm removing the impact, I will deduct it. And that also will remain in the inner column. This is because I want to deduct purchase return, if any, from this and then take it to outer column. And that sales less sales return is there in inner column because I need to eliminate profit element from the same. What do we have after this? Purchase return. How much is my purchase return? 2,500. I'll deduct it from my purchases. From 85, when I deduct 2,500 purchase return, it will come to 82,500. Then goods costing 20,000 received in March. Already received, it is included in March, it is included in 10th April's inventory. This is not inflow outflow adjustment. Remember that. This is a special item. For sale on consignment basis, of which 60% of the goods have been already sold. So this is not my inventory, somebody else's inventory. They've given it to me to sell for commission. So 20,000 worth of it is received. It's there in my godown, but it's not mine. As on 10th of April, 60% is sold. So how much is left in my godown? 40%. 40% of is there in my godown. When they counted physically, they've counted that also. But actually that doesn't belong to me. Now I'll eliminate. How much? 40% of 20,000. Less consignment stock which is there in my godown which doesn't belong to me, which is 40% of 20,000, 8,000 rupees is deducted from my inventory. Then one last adjustment. After stock was taken, it was found that certain very old and slow moving item costing 16 should be taken at 9,500. We all know that the inventory should be valued at cost or NRV, whichever is less. Cost is 16,000. Net realizable value is 9,500. When I value it at whichever is less, I would have to value it at 9,500. From 16,000, if I have to bring it down to 9,500, I have to write it down by 6,500. I will deduct 6,500 from the value of my closing stock. Then profit margin is 25% on cost. Okay, this 1 lakh is sale price. What I know is cost. If cost is 25, if profit is 25, cost is 100, selling price is cost plus profit. Sale is equal to cost plus profit. Profit 25 on cost, meaning cost 100, profit 25, sale is 125. I should do 25 by 125. Or you can use another logic where 25% on cost is 1 by 4 on cost. If it is 1 by 4 on cost, it's 1 by 5 on sale. 1 by 5 is nothing but 25 by 125. I'll deduct profit at 25 by 125 or your way 1 by 5. 25 ones are 25. 25 fives are 125. It comes to 20,000. When I deduct it, 80,000 is here. Now quickly take your calculator and do 4,50,000 plus 80,000, 5,30,000 minus 82,500 minus 8,000 minus 6,500. You will end up with 4,33,000 to be the value of inventory as on 31st of March 2025. Found keeping 10th April 2025 inventory as base. I hope you guys understood this. If you need any help on inventory or any other topic, do drop a message in the comments and I'll definitely see it and then provide you with help. Let's now solve question number 7 from our RTP for Jan 2026 CA Foundation Accounting. This question 7 is on depreciation and amortization. To be precise, this is on depreciation. Let's start solving. Let's start reading the question at first place. Messrs. Alankrit Transport Company purchased 10 buses. This is a very famous question. We've done this question plenty of times. 10 buses, 10 trucks, 50 lakh per bus. One bus meets with accident, another new bus is bought later. Let's solve it as if we're solving it for the first time. 10 buses and each bus is costing rupees 50 lakh and this was purchased on 1st of October 2021. And on 1st of January 2024, one of the buses involved in accident. So we'll start with 21. We'll do no adjustment, but do just depreciation for 21, 22, 22, 23, 23, 24. But in 23, 24, one of the buses meets with accident and that bus will completely get destroyed. So when I prepare my working note, I'll prepare one column for one bus, one column for 9 buses and a total column. That will help me do ledger account with ease. Invest time on the working note so that you can do the ledger account with ease with very less probability of doing error at any place. Don't try to skip working notes because working notes are a savior in the examination. 1st January 24, one bus meets with accident and completely destroyed. 35 lakh rupees is received from the insurance company, and on the same date another bus is purchased for the sum of rupees 60 lakh, and depreciation is 20% SLM. Perfect. Let's begin. We'll start with working note. The purchase happened on 1st of October 2021, and we bought 10 buses. I'll prepare one column for one bus and one column for the remaining 9 buses which will not meet with accident. 50 lakh here and 4 crore 50 lakh here. Together 5 crores is the value of the buses that I purchased. Then going further, we are depreciating the buses under SLM method and the year is ending on 31st of March. 31st of March 2022 when I rate less depreciation. Under SLM method, depreciation is done at 20% on this first bus which is of 50 lakh but not for the full year. I would have to do it for 6 months because the bus was purchased on 1st of October and depreciation is computed on 31st of March wherein the bus is used only for 6 months. I'll do 50 lakh into 20% into 6 by 12. This gives me depreciation of 5 lakh. And on the 4 crore 50 lakh asset, again I'll do same depreciation at 20% for 6 months. This will give me 45 lakh as the depreciation on those 9 buses. Both put together, depreciation comes to 50 lakh. And the WDV as on 1st of April 22 for all the 10 buses together is 5 crore minus 50 lakh, 4 crore 50 lakh. And for one bus, it is 45 lakh. For 9 buses, it is 4 crore 5 lakh. And I'm going to do the same at the end of year 22-23, that is as on 31st of March 2023. The bus is meeting with accident on 1st of January 2024. That's next year. And depreciation again here, same method, SLM. So 50 lakh into 20%, 10 lakh. And 4 crore 50 lakh into 20%, 90 lakh. Together, 1 crore is the depreciation. As on 1st of April 2023, book value of the asset will be 45 lakh minus 10 lakh, 35 lakh. 4 crore 5 lakh minus 90 lakh, 3 crore 15 lakh. Both put together 3 crore 50 lakh. And the depreciation is to be computed on that one single bus, not till 31st of March 24, but till 1st of January 2024. This is because that one bus met with accident on 1st of January. Let me do depreciation not on 35 lakh but on 50 lakh at 20% for the period 9 months, that is April, May, June, July, August, September, October, November, December. 9 months. Let me do 50 lakh into 20% into 9 by 12. That comes to 7 lakh 50. This 35 lakh WDV worth of asset, which is now depreciated by 7 lakh 50, has to become 0. If it has to become 0, I have to de-recognize. I have to remove this. The removal will happen at 27 lakh 50. 27 lakh 50 is the book value of that one bus which is meeting with accident. So I'll write book value of the machine. Oh no, bus destroyed, not truck. Bus destroyed is 27 lakh 50, and the price that you received on the discarding the bus from the insurance company is 35 lakh. So I'll compare 27 lakh 50,000 with 35 lakh. I've received more money, so I made profit on this bus meeting the accident. So some accidents are good. 35 lakh minus 27 lakh 50, 7 lakh 50,000 is the profit. The accounting entry will be, I'll debit my bank account or insurance company account depending if I've received or if I'm yet to receive to the extent of 35 lakh. I'll credit my bus to the extent of 27 lakh 50. Difference of 7 lakh 50 credit will be P&L. That's the accounting entry. And on the very same day, we bought an other bus for rupees 60 lakh. So I would add another bus to the extent of 60 lakh. At the end of the year on 31st of March 2024, I'm going to charge depreciation. No depreciation on this bus because it is now removed. It's not there anymore. And on this 3 crore 15 lakh WDV, remember the depreciation remains same 90 lakh what we charged in the last 2 years because method of depreciation followed in this case is SLM. I'll charge 90 lakh depreciation. And on this 60 lakh, when I'm computing depreciation at 20%, I need to keep in mind the fact that asset was not purchased at the beginning, but it was purchased on 1st of January. Meaning this asset is put to use only for January, February, March, 3 months. So I'll compute depreciation only for 3 months. 60 lakh into 20% into 3 by 12, which comes to 3 lakh. This is 57. 3 crore 15 minus 90, 2 crore 25 lakh. This is anyway 0. I'll write the total as on 1/4/2024. Have they asked us the ledger account for 1 year? No. 31st March 24 and 31st March 25. So I need to charge 1 more year depreciation and find the WDV as on 1st of April 2025. And this will help me draft the ledger. Let me write here 31st of March 2025 depreciation. This is done. And on this, I'll continue to charge same 90 lakh as depreciation because we're following SLM. And on this one new bus, I'll compute depreciation as 60 lakh into 20% full year depreciation. No months because it's there for entire year in 24-25, which comes to 12 lakh. So 57 minus 12, 45 lakh. 2 crore 25 minus 90, 1 crore 35, and this is anyway 0. Total depreciation is 1 crore 2 lakh, and book value as on 1/4/2025 comes to be 1 crore 80 lakh for 9 buses which were purchased initially and the one new bus that was purchased later put together. And I have to draft ledger account for 2 years, 31st of March 2024 and 31st of March 2025. So these are the 2 periods for which I have to draft my machinery account. So shall we draft the ledger now? Focus only on the total column. You might have been thinking that sir spent so much time doing the working note, but all the time that is spent on doing the working note is going to be paying us the reward when we do ledger account. When I draft the ledger, the bus account, I would write 1st of April 2024 balance brought down. How much is it? It is the total amount what we have here, 3 crore 50 lakh. 3 crore 50. What do I have after 3 crore 50? I have to depreciate this by 7 lakh 50 minus, write it on the credit side in my bus account, depreciation 7 lakh 50. Then the machine is getting removed. I'm going to say the bus is getting removed, 27 lakh 50. For this, I've written a detailed journal entry. Bank account debit, insurance company account, or bank or insurance company, depending whether received or not. To P&L, to bus. Bus has to be basically credited by 27 lakh 50. And when I write that, insurance company is giving me 35. Basically, I was supposed to credit by 27 lakh 50, but I credited by 35 lakh. That excess amount credited represents profit. It should be actually credited to P&L, but it is routed through bus account. Instead of 27 lakh 50 when I credit 35, whatever is the excess credit is the profit, which I'll debit in my bus account and I will be crediting it to P&L. I hope you guys understood this. And then on the very same date, we have also purchased a new bus that would come here 60 lakh. Give me a moment. Let's just swap the places. The new bus value is 60 lakh. And this profit $7,50,000, 1st of January 2024. Everything sits perfect now. So by this, I'm done with this removal. I'm done with the purchase of this new bus. I just have to write the total depreciation, which is 93 lakh. 93 lakh of depreciation in my bus account. I'll write credit side by depreciation 93 lakh. Now I'd have to identify the balancing figure here. I'll tell you how to check whether the answer that you're getting in depreciation is right. Find the balancing figure in your bus account and then check if that will match with the number here 2 crore 82 lakh. If it does, then you've done everything right. Check 350 plus 60 plus 7 lakh 50. 4 crore 17 lakh 50. From 4 crore 17 lakh 50. If you deduct 7 lakh 50, 35 lakh and 93 lakh, you will get 2 crore 82 lakh rupees, which is the balance carried down. In my bus account, in the next year, I'll write balance brought down as 2 crore 82 lakh. And that's the value that we have here as well. I'll depreciate it by 1 crore 2 lakhs and I'll end up with 1 crore 80. I'll write by depreciation 1 crore 2 lakh, 2 crore 82 minus 1 crore 2 gives us balance carried down to the extent of 1 crore 80 lakh. And this is the 2 years for which the ledger account is being asked in the question. And by this, we complete question number 7, that is on the topic of depreciation from Jan 2026 RTP. Let's now solve question number 8 from our Jan 2026 RTP issued by ICAI-style Foundation Accounting. This question number 8 is from the topic of bills of exchange. Without wasting much time, let's start reading the question. On October 2025, they have not mentioned the date, they only mentioned the month and the year. X sells goods to Y for 25,000 and this is interstate sale. They've told IGST applicable at 18%. Okay. X is the seller. X has to collect 25,000 for the goods sold. He also has to collect IGST at 18% on this 25,000 and X has to pay this money to the CBDT. So the entry will be Y account debit to sales to IGST basically. Good. Output IGST, not input. And from whose perspective are we doing this entry? Yeah, we're doing it in the from the perspective of X. Let's start writing the accounting entries. Y is our debtor. I'll debit Y account and then credit sales. Sales is to the extent of 25. On this, I'll also collect IGST at 18% and this is output IGST. I would have to collect it and pay it to government. So 18% of 25,000 comes to 4,500. Together, 29,500 is the money that I'm supposed to be collecting from Y. Debtor account debit to sales is the usual entry. Debtor's name is Y, Y account. To sales is okay. Beyond sales of 25, I'm further collecting 4,500 from Y. Got it? What's next? And drawn two bills of exchange on him. First one for 15,000 for 2 months. Second bill for the balance for 3 months. I'm supposed to recover 29,500 from Y. I'm drawing two bills. Bill number 1 for 15,000. Bill number 2 for balance. Balance is 14,500. I'll write bills receivable is an asset. Number 1, 2 months bill 15,000. Bill number 2 for 3 months 14,500. Together I'll credit Y account by 29,500. So this is the entry for bills receivable. It's a bill drawn on Y and acceptance received. Two bills. Bill number 1, 2 months 15,000. Bill number 2, 3 months 14,500. What do we have next? Y accepts and returns these bills to X. That's already done. These bills were sent to the bank for collection. Oh, these bills are not kept till maturity, not discounted with banker, not endorsed. But the drawer is choosing to send them to bank for collection. When the bills are sent for collection, banker will not instantly give you money. Banker will take the bill from you, keep it safe and wait for the date. On the maturity date, banker will collect the money and give it back to you. So it is done with an intention to keep the safety of the bill and to ensure that the money is collected on time and then given to you. Entry is bills for collection, a new asset, debit 29,500. Credit will be bills receivable of 2 months and bills receivable of 3 months, 15 and 14,500. Is the entry for bills sent for collection. On the maturity date, banker will give you money, not immediately. If it is bill discounting, banker will give you money immediately and will also cut discounting charges. If it is bill sent for collection, banker will give the money to you only on the maturity date and banker will not deduct any charges. It's part of the usual banking services. Then on 1st of October, same date, in the due course, X receives information from the bank on the due date of the respective bill that bill for 15,000 has been duly met and the other bill is dishonored. So the 15,000 rupees bill is honored and the money is received. 14,500 rupees bill is dishonored and we did not receive money. Bill was drawn on 1st October. Bill is drawn for 2 months. So 1st November, 1st December. On 1st December, I will be told that I've received money for bill number 1. 2 months bill, 15. Entry is bank account debit. I won't credit bills receivable because it's already credited by debiting bill sent for collection. I will now credit bill sent for collection 15,000. This is bill number 1 of 2 months for 15,000 honored. And that second bill, which is 3 months bill, is dishonored. That is not on 1st of December. That is 1 month later. On 1st of January 2026, if I would have received money, I would have returned bank to bills for collection. I don't receive money. I receive the bill back from the bank. So I'll debit bill account and I'll credit bill sent for collection. This is for 14,500. On this bill, I might have paid noting charges. Have they given any? Yeah. Noting charges are paid to the extent of 500. To prove that the bill is dishonored, the banker has charged me money. That is all notary fees. So this is an expense. I'll debit noting charges. I've paid to banker, credit bank to the extent of 500. Noting charges is incurred when the bill is dishonored on the date of dishonor. This is initially paid by the drawer, but later it has to be reimbursed by drawee. He is the reason for the bill dishonored, so he is the one you should pay. I won't keep this bill of 3 months dishonored with me. I'll give it back I'll credit bills receivable 14,500. I'll also credit noting charges 500 because that's not my expense. From Mr. Y, I'm supposed to collect 14,500 for bill number 2, and I'm also supposed to collect 500 towards noting charges. Together, Y now owes me 15,000 rupees. Anything else that's been asked? I think that's it. They've asked us to ignore date column, but I've written the entry with date column. This is the entry at first for sales made, including GST. This is the entry for bill received. This is the entry for bill sent for collection. Then the entry for bill sent for collection honored. Then bill sent for collection dishonored. Noting charges paid. Dishonored bill returned to Mr. Y. Let's now start solving question number 9 from our RTP Jan 2026 for CA Foundation examination. This question number 9 is on final accounts of sole proprietor. They have given trial balance of Sri Mohan Gupta. What do they want us to do? I think they would want us to prepare trading P&L and balance sheet. No, doesn't look like a question where they would want us to do manufacturing. Anyways, let's see. Come to the end of the question. They've told prepare trading and profit and loss account for the year ended, and they also want us to do balance sheet. Okay, simple. Let's do it. But before we solve, we'll mark the items with adjustment so that we will end up giving little space for them or open ledger if need be. Depreciation is to be provided. On what items are we supposed to provide depreciation? Building, furniture and fixture, office equipment, and motor car. Furniture and fixture, office equipment, building, motor vehicle. All these 4 items which have depreciation adjustment, I put star so that I can write their balance in the inner column in my balance sheet, and I'll write the post depreciation value only in the outer column. Then I have value of the stock. This is closing stock. 1 month of rent for godown is outstanding. Oops. If 1 month rent is outstanding, what is given in the trial balance is 11 months rent. Come here. Do you find godown rent, godown rent, godown rent? Godown rent 55,000 is only for 11 months. 1 month rent is completely outstanding. So 55,000 is paid, 5,000 is outstanding. Total rental expenditure is 60,000. What's after rent for godown? Then there is an adjustment on interest on loan from Rajan, 10%. That loan is taken in the middle of the year. So we might have to pay interest on that loan. So next to this 4,400, I'll put one star. Once we prepare our final accounts on the loan, I'll compute interest at 10%. Not from the beginning to end, but from 1st of July. If that interest amount matches with 4,400, good. If it doesn't, then I would have to record the outstanding interest as liability and also as expense. What do we have after that interest adjustment? After interest adjustment, I have reserve for bad debts is to be maintained at 5%. Do we have provision for bad debts anywhere here already? Provision for bad debts 10,000 is there. Put one star next to it because we might have to revise this provision. And this might also affect my debtors. Debtors 2,80,000 cannot be written in outer column. I'd have to record it in inner column in my balance sheet on the asset side. I have to deduct the current year provision after revision, and only then the balance will go to balance sheet outer column. What do we have after sundry debtors? Then we have insurance premium includes 42,000 paid towards proprietor's life insurance policy, and balance of the insurance charges cover the period from 1st of April 24 to 30th of June 25. Okay, there is some adjustment for insurance premium. Identify insurance premium. Where do we have insurance premium? Here, 48. One star next to it. So insurance premium has to be dealt with. We'll deal with that. Then any other item of adjustment? After insurance premium, F done. That's it. We mark all the items which has adjustment. There is more adjustments in insurance premium. Part of it is drawings. Part of it is prepaid for next year. We'll deal all of it at once when we read the adjustment. So now let's start from the beginning. We mark everything which has adjustment. Never ever solve a final accounts question straightly. First finishing trading and then P&L and then balance sheet. Or don't ever start the question without knowing the adjustments. Because you might end up writing that amount in the outer column. Later realize that it has adjustment. Don't know where to write. You don't have space. So don't do this. First read the adjustment. Make the marking. Then open the format of trading, P&L, balance sheet. All of it. Then read the items in the order and post them to the respective place. Don't try to finish trading first and then do PL and then do balance sheet. If you try to do that, you will end up taking way more time than usual for solving the questions. That's the point. Let's begin. Capital account. Capital account 14,11,400 will appear in my balance sheet, trading P&L balance sheet. In the balance sheet, on the liability side, I would write capital as 14,11,400 in the inner column. Why? From this 14,11,400, I have to deduct drawings and I should also add current year net profit. Only then the balance will go to outer column. What's after 14,11,400? Purchases. How much is the purchases? 12 lakh. Purchases of 12 lakh will go to trading account debit side. I can see right below this that there is purchase return. So I'll write purchases in inner column in my trading so that I can deduct purchase return from the same and then write the net purchases to outer column. Purchase trading debit 12 lakh. Then we all know purchase return. How much is purchase return in this case? 18,000 rupees. 18,000 purchase return I'll deduct from my purchase. From 12 lakh, if I deduct 18,000, I'll end up getting 11 lakh 82,000 as my purchases net. Then I have with me sales. Sales is 15 lakh rupees and sales return is 24,000. Sales return of 24,000 will be deducted from sales of 15 lakh. In my trading account, I'll write on the credit side sales 15 lakh less sales return 24,000, whatever was just given. From 15 lakh, if I deduct 24, I'll get 14 lakh 76,000 as my net sales. I've written sales minus sales return. Let's proceed. After writing sales minus sales return, we'll go for freight inwards. Freight inward 62,000 is direct expenditure. Expenditure incurred to carry the inventory to the factory. Direct expense. If it is freight outward, it will be written in P&L account on the debit. Because this is direct expense, I'll write 62,000 in my trading account on the debit side. What do we have after this? Then I have with me carriage outwards. Carriage inwards is direct expense trading. Carriage outwards is indirect expense P&L. 8,500 will be written not in trading but in P&L account debit side as carriage outwards expense. Then rent of go down. Rent of go down I'll write in my P&L but in the inner column 55,000. Why? There's an adjustment. I know the adjustment that there is 1 month rent outstanding, but I will not adjust it right now. I'll adjust it later. For now, we'll write rent of go down 55,000 in the inner column. Later, we'll adjust that 1 month outstanding and then post it to outer column. What do we have after rent of go down? Rates and taxes 24,000. Rates and taxes 24,000 is expenditure in my P&L. I would write rates and taxes, rent and taxes, rates and taxes, rates and taxes. I would write 24,000 in the debit side of trading account. After that, salaries 72,000. Salaries 72,000 is an expenditure in my P&L. I would record it as it is. There is no adjustment whatsoever. Salary is 72 done. Then I have with me discount allowed. How much is discount allowed? 7,500. Discount allowed 7,500 is expense in P&L. I will write discount allowed 7,500 expense in P&L account debit side. I have with me discount received 12,000. This is income to be credited in P&L. In my P&L, I'll give little space for gross profit. I'll write discount received 12,000 on the credit side. Got it? What do we have after discount received 12? Then I have with me drawings of 20. Drawings is reduction in capital. In my balance sheet, on the liability side, capital will be written in inner column. From that, I will deduct drawings of 20. In my balance sheet, on the liability side, capital is on the liability side inner column. From that, I will deduct drawings of 20,000. What's after drawings 20? Then we have with us printing and stationery 6,000. Printing and stationery 6,000 will be written in P&L account on the debit side. Printing and stationery 6,000. Then insurance premium 48,000 is an expense in P&L, but there are two adjustments against this. One, part of it is personal insurance which will become drawings. Second part of it is some insurance premium is prepaid for next year. That should be again deducted from expense to be written as asset. So let's write insurance premium in the inner column 48,000 rupees. What's after that? Then we have electricity charges. Electricity charges of 14,000 rupees is expense to be written in P&L account debit side. I'll write electricity charges 14,000 expense in P&L account debit side. What's after electricity that we have? We have general expenses to the extent of 11,000. General expenses of 11,000 is again an expense. I'll write it in my P&L account on the debit, general expenses 11,000. What do we have after general expenses? Then I have bank charges. Bank charges of 3,800 is also expense. I'll write bank charges also in P&L account, debit side 3,800. Then I have bad debts. Bad debts is again 12,200 rupees. Bad debt is again expense. Bad debt will be written in P&L account on the debit side 12,200 rupees. Bad debt 12,200 done. Then come to the next expense. We have repairs to the motor vehicle 13,000. Repairs to the motor vehicle 13,000 will also be written in P&L account debit side. Repairs to motor vehicle 13,000 rupees. Done. Next, interest on loan is an expense to the extent of 4,400, but there is an adjustment. Loan was taken from Mr. Rajan during the year on 1st of July. From 1st of July on that loan of 60, I need to compute interest at 10%. Check whether if there is any outstanding. Right now, we'll not do all that. We'll do that when we read adjustment. Now, I'll write interest on loan 4,400 in the inner column. That's it. Nothing else. After a rate interest on loan 4,400 in inner column. Next I have with us provision for bad debts 10,000. This is existing provision already created in previous year. Usually from our debtors in the balance sheet, I am supposed to deduct provision. That provision existing is 10. I would have deducted 10 if not for any adjustments. But they've told provision to be maintained at some percentage. I'll take the debtors that they give, apply the percentage and then check the provision to be maintained. If that provision to be maintained is more than 10, I have to create that additional provision by debiting P&L. If that provision to be maintained is less than 10, then there is excess provision. I'll write off some provision by writing it to P&L account credit. Right now, I don't know anything. I'll tell the existing provision is 10 and then wait for the adjustment. What's after this? I have loan from Mr. Rajan, 60,000. Liability. In the balance sheet on the liability side, I'll write loan from Rajan, 60. I've taken loan from Mr. Rajan, liability of 60, balance sheet liability. Then I have sundry creditors to the extent of 62,000. This is again a liability in the balance sheet. I'll record sundry creditors, 62,000. Then we have motor vehicles as asset for 1 lakh. In the balance sheet on the asset side, I'll write motor vehicle 1 lakh inner column. What else do we have? We have land and building to the extent of 5 lakh. This is also asset. After motor vehicle, I'll record land and building 5 lakh rupees as asset inner column because there is depreciation to be deducted. Then we have office equipment 2 lakh. This is also asset in the balance sheet on the asset side. I would have to deduct depreciation on this later. Then furniture and fixture, same problem, 50,000 in the balance sheet on the asset side, inner column because we would have to further deduct depreciation to find the closing balance. After furniture and fixture, we have stock as on 31st March 2024. This is opening balance 3,20,000. Opening stock should be written in trading account. On the debit side, I would write opening stock 3,20,000 rupees. After this, we have sundry debtors to the extent of 2,80,000. In the balance sheet, on the asset side, I would write 2,80,000 debtors as my asset. And cash at bank, 22, cash in hand, 16. These two are assets. In my balance sheet on the asset side, I would write cash at bank, cash in hand, assets as 22 and 16. By this, I've completed the entire trial balance. What will I do now? I'll go to adjustment, see each adjustment one at a time, make the responsible adjustment and then leave the impact on my final notes. To begin with, building depreciation by 5%. Let's do. On land and building, I'll do depreciation at 5%. 5 lakh into 5% comes to 25,000. Building closing will be 4,75,000. This 25 building depreciation should come in my P&L. In profit and loss statement, I will write to depreciation on land and building, it is 25,000. You can post it all together. I have written it now. Then furniture and fixture to be depreciated by 10%. On furniture, I'll write 10% depreciation, which is 5, making it 45. This 5,000 I will record here. Furniture depreciation 5,000. Then on office equipment 15%, on motor car 20%. On office equipment, 15%. 15% of 2 lakh is 30. Post depreciation, it will become 1 lakh 70. And 30,000 depreciation on office equipment will be written in my P&L account on the debit. Office equipment depreciation. Office equipment depreciation 30,000. 15% of 2 lakh 30. Then on motor vehicle, I need to depreciate by 20%, which is 20. Motor vehicle will become 80,000. 20,000 depreciation I'll write here. So total depreciation is 20 plus 25, 45. 45 plus 30, 75. 75 plus 5 is 80. Total depreciation written in P&L debit. Then value of stock at the close of the year is 4 lakh 10. This is closing stock. This will be written in trading account on the credit side as closing stock, in the balance sheet on the asset side as stock. Let me write in the balance sheet on the asset side, I will write stock 4 lakh 10. In the balance sheet on the asset side 4 lakh 10. Next up, in our trading account on the credit side, I would write closing stock 4 lakh 10. What's after closing stock 4 lakh 10? 1 month of go down rent is outstanding. If 1 month rent is outstanding out of 12 months, can I say 11 months rent is paid? Rent in my P&L is 55. 55 is for 11 months. Do 55,000 divided by 11, you get 5,000. That is 1 month rent which is outstanding. Rent which is outstanding is expense and liability. To the extent it is expense, I'll record it in my P&L, increasing my rent from 55 to 60. 5,000 because it is not paid. In the balance sheet, on the liability side, I'll record outstanding go down rent, 5,000. Expense also booked, liability also recorded. I have with me interest on loan from Rajan is payable at 10% per annum. The loan was taken on 1st of July. How much is the loan from Rajan? 60. On 60,000, would have to compute interest at 10% from 1st of July to 31st of March. Let's count. July, August, September, October, November, December, January, February, March. How many months is it? 9. Once again, July, August, September, October, November, December, January, February, March. 9 months. On 60,000 at 10% for 9 months. How much do we get? Interest should actually become 60,000 into 10% into 9 by 12. Interest should actually become 4,500. But in trial balance, there is only 4,400. Meaning what? 100 rupees of interest is not paid. Interest expenditure is 4,500. But what is paid is only 4,400. So only 4,400 is available in trial balance. 100 what is missing, I will write it as outstanding interest. Outstanding interest is an expense, though it is not paid. And this 100 should be shown in my balance sheet on the liabilities side as interest on loan 100. So I've written it as liability 100. I've also written it as expense 100. Next adjustment. Reserve for bad debts, basically reserve for doubtful debts, is to be maintained at 5% of debtors. How much is our debtors? Debtors is 2 lakh 80. Provision is to be maintained at 5%. 5% of 2 lakh 80 comes to 14,000. So provision is to be maintained at 14. But provision what is already there is 10. 4,000 rupees of provision has to be created in the current year. The provision to be created 4,000 will become expense. When I create 4,000 rupees of provision, in my P&L, I'll record provision for doubtful debts 4,000 created, 14,000 to be maintained, 10,000 existing, 4,000 provision created as expense. Once I create 4,000 provision, my 10,000 rupees of provision will become 14,000. From 2 lakh 80, I will deduct provision of 14. My debtors will actually become 2 lakh 66. Debtors is 2 lakh 80. Provision is to be maintained at 5%, which is 14. Already provision 10. Provision to be created 4. 4,000 is expense in P&L. Provision will become 10 to 14. 14 is deducted from debtors to revise my provision to revise my debtors to 2 lakh 66. What's after this provision? Insurance premium includes 42,000 paid towards proprietor's life insurance policy. 42,000 is paid towards proprietor's life insurance. That is personal expense. It should not be written as an expense in my PL. In my PL, insurance premium 48. From that, I'll deduct personal life insurance of 42. This 42 is not an expense, so I've reduced expense. 42 is drawings. Drawings will reduce my capital. In my balance sheet on the liability side, from my capital, I'll deduct 42,000. In fact, let me make it nicer for you. Personal insurance minus 42,000. So there are two drawings. One is cash withdrawn 20. Second one is insurance of 42. Done. Next, the balance of the insurance is taken from 1st of April to 30th June. But our accounting year is 1st of April to 31st March. We've taken insurance from April to June of next year. This year, April to June of next year. This year, April to next year, March is 12 months. April, May, June. So this insurance policy is taken for 15 months. 15 months premium is paid. 12 months is current year expense. 3 months will become prepaid insurance expense to be recorded as asset. Let's see this. How much are we left with after we deduct 42,000 from 48? We're left with 6,000. In that 6,000, how much is prepaid? 3 months of insurance premium is prepaid. 6,000 divided by 15 into 3. That is for April, May, June of next year. 1,200 is prepaid insurance. If I deduct it, my insurance premium will become 4,800. This 1,200 rupees of insurance premium, whatever I've paid in advance, is asset, prepaid expense. In my balance sheet, on the asset side, I will record prepaid insurance premium 1,200 rupees. What is after that? That's it. We're done with all the adjustments. Now what we need to do is pretty simple. Close our trading account, identify GP, put it into P&L account, identify net profit, add it to capital and see our balance sheet tally. Check the total here. 14,76,000 plus 4,10,000 comes to 18,86,000. From 18,86,000 deduct 3,20,000, 11,82,000 and 62. We'll end up getting 3,22,000 as gross profit. In my P&L, I'll write gross profit 3,22,000. Add 12,000 discount to it. It will become 3,34,000 as total on the credit side. From this 3,34,000, I will deduct. Take your calculator, type 3,34,000 to minus 8,500, minus 60,000, minus 24, minus 72, minus 7,500, minus 6,000, minus 4,800, minus 14,000, minus 11,000, minus 3,800, minus 12,200, minus 13,000, minus 4,500 and minus 4,000. Further deduct 80,000 depreciation. You'll end up with net profit of 8,700. This net profit of 8,700 should be added to our capital. Then check how much is the capital. 14,11,400 minus 20 drawings minus 42 personal insurance minus 8,700 net profit. That leaves you with 13,58,100. 13,58,100 capital plus 60 plus 62 plus 5,000 plus 100. Total on the liability side comes to 14,85,200. Similarly, let's take the total on the asset side. 80,000 plus 4,75,000 plus 1,70,000 plus 45 plus 2,66,000 plus 22 plus 16 plus 4,10,000 plus 1,200. This will leave you with 14,85,200 as the total of the balance sheet on asset side. As the liability and the asset side match, that's the end of the balance sheet on this final accounts question. Let's now solve question number 10 from our Jan 2026 RTP issued by ICAI for CA Foundation examination. This question is from the chapter of not-for-profit organization. They've given us receipts and payment account, like you can see. So basically, they would have requested you to prepare income and expenditure. Let's anyways read the end of the question. What do they want us to do? They want us to prepare income and expenditure account along with balance sheet as on that date. So receipts and payment account is given. Income and expenditure and balance sheet is to be prepared. We all know receipts and payment is equivalent to cash book. Income and expenditure is equivalent to P&L account. Balance sheet is balance sheet. The difference between NPO and other final accounts of profit making entity is P&L account would become income and expenditure. We would not find profit. We would find excess of income over expense. We would find excess of expense over income, which is surplus and deficit, which is like profit or loss. Another important point is you cannot withdraw the money from an NPO. And the capital in an NPO is not capital, but it is called as capital fund. and whatever donations and all that you receive will get added to the capital fund. Let's see this one item by item. To begin with, we have with us, we'll just read the adjustments first, make the marking, and then start the rest of the answer. There is some adjustment with regard to the first one. The adjustment is they've given a lot of opening balances. Subscription, there is some due. So in the receipt side, you have subscription. We'll open one subscription account. That's when we'll identify how much is the subscription income for the year. Then after that, furniture, there is some balance. Furniture, if there is any receipt or payment, furniture is, there is some payment for furniture, meaning furniture is purchased. I'll open one furniture ledger. Then books, there is an adjustment. Books, have you paid any money for books? Yes, you have paid some money. Books have been purchased. I'll open one ledger. First, identify the adjustments and make marking in the base data so that you know this item has adjustment and you'll be able to adjust it. If you straight away start solving it, then you'll get stuck later. Then books, we put one star. Building, on the payment side, do you have building anywhere? Building. No adjustment on building. Receipt side, do you have any building? Building, no. Building right now looks like it doesn't need any working note, doesn't need any ledger. Later, if there is any, we will see. Stock of sports material, on the payment side, you have sports material here. You paid money for sports material. Sports material is an asset. It will be opening, it will have opening balance, it will have purchase, it will have consumption, it will have closing balance. You'll open one ledger for sports material, put one star there. After that, creditors for printing. This don't open ledger, but remember this is like outstanding expense for printing. And this has to be marked next to our printing expenses. On the payment side, you have printing and stationery, put a star. 12,000 rupees is paid, but 12,000 rupees is not the element of expense. Along with 12,000, we have to further add 2,500 as expense when we prepare income and expenditure. So our current year expense will not be 12, but it will be 14,500. Then some subscription information is there. So we'll open one subscription account. Have I already put a star? Yeah. If you want, I'll put one more star. Then after subscription information, we have municipal taxes is paid on 1st of April every year. See, in the present question, year ending is 31st December. So our year is January to December, but municipal tax is paid April to March. When we pay April to March, no, 3 months of municipal tax is paid in advance and 3 months of municipal tax is already there as opening prepaid. So every year beginning, there is 3 months opening prepaid. Every year's end, there will be 3 months opening prepaid. So opening prepaid and closing prepaid, both are there with regard to municipal taxes. So actually adjustment is not needed, but we would still have to write it as an asset. So I'll put one small star next to this. In 6,000 into 3 divided by 12, how much our amount comes? That will be opening balance sheet asset and closing balance sheet asset. 6,000 itself is expense, 6,000 is payment. But anyways, I'll teach you with the help of a detailed working note later. Then we're done with municipal tax. One member donated billiards table. This will not affect any other item in our balance sheet or income and expenditure. Billiard table will become an asset, 50,000. Donation received for billiard table will become a liability in the liability side of the balance sheet. So liability side you write 50, asset side you write 50. Ashte. Easy to do. Then we have with us books are worth 46,000 and stock is worth stock of sports material is worth 4,000. This is closing balance. This will appear in the balance sheet as asset, and you already put star mark for books and star mark for sports material. In that ledger, I'll write these two balances as closing balance. We would know opening, we would know closing, we would know receipts and payment in this question. Income and expenditure will be balancing figure. Any ledger that you prepare, opening balances are given, closing balances are given, receipts and payment ledger is given. From there, I'll write receipts and payment balance also. Balancing figure will be income and expenditure, which will go to income and expenditure account. I hope everyone understood this part. Let's begin. Don't ever income and expenditure first and then prepare balance sheet. Always keep the format of income and expenditure and balance sheet ready. As and when you read that, keep posting. They've asked only income and expenditure and balance sheet. But to close my balance sheet, I need surplus or deficit. Excess of income over expense or expense over income from my income and expenditure. So I'm preparing this. Let's say I found surplus here. This surplus should be added to the capital fund. I don't know capital fund. I need to find the opening capital fund. So, though they've asked balance sheet as on 31st December 2025 in the question, I would also be required to prepare balance sheet as on 1st of January 2025. This is not because they've mentioned in the question But this is because I cannot complete my balance sheet as on 31st December without opening capital fund. And to know opening capital fund, I open opening balance sheet. Let's now begin from the beginning. What is the first item that I have? I have opening bank balance 7,500. 7,500 rupees, which is opening bank balance, will appear in my opening balance sheet as an asset. I'll write in my opening balance sheet cash and bank balance 7,500 asset. Then subscription. Subscription received during the year is 40,000. In receipts and payment, I've written subscription to subscription. In subscription account, I would have to write by receipts and payment. How much is received? 40,000. This is the money received. Don't end here. They've given an adjustment here, including 2,000 rupees for 2024. My current year is 2025. My current year is 2025. I have received 2,000 rupees for previous year. If I have received 2,000 rupees for 2024, that means in the previous year, there was some amount of subscription amount earned, accrued, but not received. 2025 is current year. 2024 is last year. In the last year, I have earned some subscription income, which I have not received in current year. That will appear as an opening balance, debit balance in my subscription account as an asset. How much? I don't know. Sir, isn't it 2? No. Received is 2. Outstanding need not be 2. If outstanding is 2 and received is 2, there would be no closing balance. What if last year subscription accrued but not received is 3? You received 2. Here you will write balance carried down for 2024, 1,000. There might be some amount of opening outstanding subscription still not received. We don't know right now. I can't conclude. I'll write by receipts and payment 2024, 2,000 and wait. What's after this? Then I have donation. 2 donations, 15,000. I'm assuming this donation is not revenue in nature. Donation is capital in nature. Because this donation is capital in nature, in my balance sheet in my closing balance sheet on the liability side, I will write donations 15,000 rupees. Donations are usually capital in nature. Donations are usually not revenue. If in case they specifically mention that this much of donations are revenue in nature, treat them as revenue. Then I'll take it in my income and expenditure as income. Otherwise, donation would go to balance sheet on the liability. You can write it either separately like this or you can add it to capital fund. Either ways, it is okay. Then after this 15, I have life membership fee received. I have received life membership fee of rupees 35,000. This 35,000 will become my liability because life membership means once I take the money from these people, I'm going to give them access to the facilities from my club forever. So after I write capital fund in my closing balance sheet, which I don't know yet, which I'll find using my opening balance sheet. To this, I will add life membership fee of 35,000. If I take subscription from you for every year and then provide you services at my club, that will be my income. If I take subscription once and I give you access for lifetime, that is life membership. That should be added to capital fund. That should not be returned to income and expense. Why? That is donation in lump sum. I'm going to give you service for next 25 years. How can I write it in current year income and expenditure? If the club gives a policy that it is expected that the member will be alive for next 10 years, then 1/10 of it will be returned to income and expenditure every year. But if they don't mention anything, straight away add it to capital fund. What do we have after life membership? 35. Then we have with us to sale of furniture at book value 5,000. 5,000 rupees worth of furniture is sold. I told you we need to open one furniture ledger. In my furniture ledger, on the credit side, I'll write receipts and payment, sale 5,000. Have we made any profit or loss on sale? I don't know. We might have made some profit. I don't know whether we made or not. Right now, I'll just keep it empty. We might have actually made some profit on sale of furniture. I don't know. 5. Next, entrance fees of rupees 10,000. Have they given any adjustment on entrance fees? No, we did not come across any adjustment. Entrance fees in this case where they've not mentioned anything can be either treated as income in income and expenditure or treated as capital fund and then add it to our capital. Which assumption is right? Either of it is fine. You can write it as income, but I am adding it as entrance fee to be capitalized. I'm making this assumption. Is it right to write it as income? Absolutely yes. The only reason why I'm adding it to capital fund is ICAI has done this. So I'm following the similar assumption. If in case you end up writing it as income, your answer will not go wrong. Your excess of income or expense will become more. That will get added to capital fund. Balance sheet will tally at the same amount. Yes, your surplus will change, but it is okay. You will be given full marks even if you make such assumption. I've added it to capital fund directly because institute has followed this assumption. What do you have after this? Interest on 10% investments for full year that is received to the extent of 20. Here, you need to be careful about two things. One, interest is income. I'll write it in income and expenditure. Next thing is, if you received interest 10% and the amount is 20,000, 10% interest is 20,000. 100% of the investment is not 20. How much is it? 20,000 divided by 10%. That becomes 2 lakh. So the investment is 2 lakh, interest on it 10% is 20. So 2 lakh should become asset. They have not told anywhere that the investments are sold or purchased. If they would have given on the payment side, it is purchased. If they would have given on the receipt side, then it is sold. So nowhere they mentioned anything about investment. Observe if you want. So what do I say? This investment was there last year also. This investment is there this year also. So don't forget to write investment of 2 lakh in the opening balance sheet as well as closing balance sheet. Without fail, without forgetting, write 2 lakh rupees investment in both opening and closing balance sheet. Come on, let's write that. In the income and expenditure account as an income, I'll write interest on investments 20,000. And in my balance sheet, I would write 10% investments 2 lakh. This closing balance sheet. Similarly, in the opening balance sheet, I'll write 10% investments 2 lakh. It is an asset on the opening date as well as on the closing date because no investment is purchased or sold during the year. On 2 lakh rupees, 10% interest will become 20,000, which is my income in income and expenditure rightly recorded. Then I have with me match fund 40. Usually any expenditure incurred to conduct the match will be written in P&L account credits, P&L account debit side. But if there is a specific fund which is raised, any expense will be deducted from the fund. Any income also should be added to the fund. So match fund is 40. This match fund received is like a donation. In my balance sheet, I'll write match fund. I don't know how much is opening, but I know donation received during the current year is 40. So I'll write match fund opening, don't know, space, add donation received during the year 40. Any match expenses will be deducted from this. But match fund cannot become negative. Let's say opening fund is 0. Donation received is 40. 45 incur 45,000 for match expense. You cannot write fund as minus 5. You deduct only 40,000 from the fund. 5,000 incurred over and above the fund will appear in income and expenditure as expense. But what if you incur 32,000 as match expenses? From 40 you deduct 32,000 match expenses. Write 8,000 as closing donation. I hope you all understood. Next, after match fund 40, we have donation for building fund. How much is this? 45. We are constructing one building for our sports club. To construct the building for our sports club, I've collected 45,000 donation. So what would I do? In my balance sheet on the liability side, I will write building fund. Do we know how much is the opening building fund? Don't know. To this existing building fund, I'll add 45. If there is opening building fund, I'll add it to 45. I'll add that 45 to that. If not, I'll write 45 only as my closing building fund. What's after building fund? When I have sale of newspapers 2,500 expense in my income and expense, I'll write expense, sorry, income, no, sorry, income, sale of newspapers, income 2,500. I've sold newspapers, old newspapers, Raddi, Gujri, Kabadi. My salary is 14,000. Expense, payment is equal to expense. There is no outstanding, there is no prepaid. If they had given some adjustment, there would have been prepaid or outstanding. What's after salary is 14? We have match expenses. How much is match expenses? 28. Usually by default, 28,000 match expense would have appeared in income and expenditure as expense. But because we have match fund, 28,000 of match expenses will not be deducted in your, will not be debited to your income and expenditure expense. But in my balance sheet, from my match fund, I'll deduct match expense 28. If opening is 0, 40 minus 28, 12 will appear here. If opening is 10, 10 plus 40, 50 minus 28 will appear here. Right now, I don't know. I'll leave it like that. Then I have sports material. Payment if you have made for sports material, it is like purchase of sports material. How much sports material did you buy? 15,000. We need to open one sports material ledger. I've given a star there. In your sports material account, debit side will write 2 receipts and payment 15. This is purchase of sports material. You literally paid money and then purchased sports material. In sports material account on the debit side, 15,000. What's after this? Then we have printing and stationery, 12,000. This is expense. I will write it in my income and expenditure as expense. But there is one star. What does it mean? This was simple one. You don't have to open ledger. There is some outstanding printing and stationery expenditure. Once you add that, we'll write it to outer column. For now, keep it as 12. What's after that? Then we have honorarium 5,000 rupees. Honorarium 5,000 rupees is expense, paid. Write it in your income and expenditure on the expenses. Honorarium 5,000 rupees. Then we have furniture. You made payment for furniture, which means you have purchased furniture by 15,000. In your balance sheet, on the asset side, furniture should appear. But 15,000 is not the opening furniture balance. It is purchase made. I think we opened a ledger. In the furniture account, I'll write 2 receipts and payment 15 here. I don't know my opening. To opening, I'll add 15,000 purchase. I'll deduct sale. I'll deduct depreciation if any, and then find the closing furniture. That will appear in my balance sheet as asset. What's after furniture? We have magazines and journals. Magazines and journals is 10,000. Magazines and journals of 10,000 will appear in your income and expenditure as expense. Magazines and journals 10,000. End of the story. Easy. After magazines and journals, books 35,000 rupees. Books are purchased to the extent of 35. I'll open one ledger called books ledger. On the debit side, I should write opening balance, which I don't know, but I've purchased books to the extent of 35. In receipts and payment, it is buy books. In books account, it is 2 receipts and payment. Amount is 35,000. What's after this books 35? Municipal taxes 6,000. There is an adjustment for this also. I don't want to open ledger. 6,000 is payment, 6,000 is expense. Into 3 by 12, you do whatever comes, that is opening balance sheet asset, closing balance sheet asset. That's the end of the story. But for those who don't understand it, if I tell that fast, I'll slowly teach it to you also. In municipal taxes account, I'll write debit side to receipts and payment by municipal taxes. Yeah, that's correct. This is to receipts and payment. How much is paid? 6,000. In municipal taxes, I've written 2 receipts and payment 6,000. I'll later teach you the adjustment. Don't worry. Balance carried down 80,000. This is the closing cash and bank balance. This will write it in my balance sheet as asset. Closing balance sheet. This is my closing balance sheet. I would write cash and bank balance 80,000 as asset. By this, I'm done with my receipts and payment. Now I'll go to adjustment one at a time. Subscription due. These are all on 1st of January. Opening balance 3,000 rupees is opening subscription due. Come to our subscription account. 3,000 rupees is subscription due for last year. Now you observe 3,000 was outstanding for 2024. In that 2,000 is paid. How much is still outstanding for 2024? 1,000. Don't forget this. This is the important part. If you would have straight away written this 2 year, it would have been wrong. So 3,000 is the opening subscription. In that 2,000 rupees is received. 1,000 is still outstanding. This 3,000 will appear in my opening balance sheet as asset. In my opening balance sheet, I would write subscription due 3,000. 1,000 is subscription due, but this is not the only amount of subscription due. There might be some subscription due for 2025 also. Who told that entire 2025 subscription is received? We will write that also in the inner column, totally to outer column, and then write it to balance sheet. For now, ignore. Come to next item. Furniture 10. This is the opening balance of furniture. This I would write it in my opening balance sheet. This is my opening balance sheet. I'll write furniture 10,000. I need to find the closing furniture. For that, I open one furniture ledger. Debit side, I'll write 10. Opening is 10. I purchased 15. 25 should be there. In that 5 is sold. Closing is 20 if there is no further adjustment. If there is depreciation, I might have to do. You might wonder, sir, why did you open ledger? You could have straight away written in balance sheet inner column. You need to understand. In this question, it might be simple. 10 plus 15 minus 5. There is no depreciation. What if they had given depreciation adjustment? And what if they told that purchase happened on 1st of July? Then you had to depreciate 10,000 separately, 15,000 separately, and then find the closing balance. So many things you can't do in inner column of balance sheet. There are limited things that you can do in inner column of balance sheet. What a lot of you think is, by doing an adjustment in the inner column of balance sheet, you will save time. Actually, no. Adjustment is adjustment. It will take the same amount of time. You feel you've taken less time because you wrote inner column. Instead, open a separate ledger and write. Two advantages. Number one, balance sheet will look clean. Number two, if you do some error, balance sheet is still clean. Error happens in working note. Working note can be redone, balance sheet will be correct. If you do error in the balance sheet only, then gone. Please don't risk. Write it separately. You're not going to save any time. In fact, you will end up spending 3 months extra if you try to take shortcut. Yeah, in the CA foundation examination or at CA inter or any level of examination, you are supposed to write the answers correctly, not quickly. First badre ಗೆಲ್ಲು ಕೊಡೋದು ಕಪ್ಪು, pass ಆದರೆ ಕೊಡೋದು marks card. CA exam, they'll not tell who gave first. Will be given 10 marks extra. No. If you take full 3 hours but you write correct answers, you'll be given full marks. So remember, it's not a running race. 15,000, oh sorry, 10,000 furniture return in furniture account as well as in my balance sheet asset side. Then we have with us books of 20,000. Books of 20 in my books account, I'll write opening balance 20 and I'll also write this 20,000 in my balance sheet on the asset side, books 20. Books 20. Then building. How much is building? 1,25,000. Building of 1,25,000 is asset in my opening balance sheet and I would have to write it in my closing balance sheet also. There is no adjustment for building. No depreciation, nothing given as it is. Books I would have to adjust and then write. Furniture I would have to adjust and then write. So I've kept it without writing the closing balance. Then we have stock of sports material. Closing stock of sports material 4,500. In my closing balance sheet, I'll write sports material. Oh, closing is 4. No, sorry. This is opening balance 4,500. Sorry. In my opening balance sheet, I will write sports material 4,500. And we open ledger. And in this ledger is where we'll find our closing sports material. In the ledger, I'll write debit side to balance brought down 4,500. Later, I'll find the closing balance and write it to my balance sheet. Understood? Then what do we have? Creditors for printing 2,500. This is actually not creditors. Don't treat it as a creditor and then open a ledger. Creditors means you owe them. You haven't paid them. It's a liability. How much is your liability? 2,500. 2,500 rupees worth of printing and stationery expenditure is incurred but not paid. So 2,500 rupees will be added to our expense. Here in our P&L, income and expenditure, we have printing and stationery. I'll add, this is opening creditors. Opening creditors. Last year's outstanding paid this year. I have paid 12,000 rupees. In that, 2,500 is actually paid for last year. So current year expense is only 9,500. And 2,500 was opening outstanding from last year. So it's a liability in the opening balance sheet. This is my opening balance sheet. On the liability side, I'll write creditors for printing and stationery 2,500. Outstanding from last year, paid in current year. Just because you paid it in current year, it's not current year expense. What's after that? Then we have with us, a club has 1,000 members and 50 rupees per member is a subscription. Either they pay or they don't pay. This is my income. 1,000 members, 50 rupees per member. In my income and expenditure account, I need to write on the income side. By subscription, 1,000 members into 50 per member, which comes to 50,000. And this 1,000 into 50, 50,000. In income and expenditure, I write by subscription. In subscription account, I should write to income and expenditure. 2025, 1,000 members into 50. How much is it? 50,000 is my income. Out of 50, I should have received everything. If I don't receive anything, either it should have been pre-received in the past or it will become closing outstanding. We will find it later. But for now, you understood, no? Current year subscription income is 50,000 and 50,000 is supposed to be received but not yet received. Let's proceed. 20 members paid their subscription in advance for 2024. 20 members have paid their subscription in advance in 2024. So current year is 2025. 20 members paid this 2025 subscription last year only. So it is pre-received subscription. How much is pre-received subscription? Pre-received subscription is liability. We have received in 2024 for the year 2025. 20 members into 1000 comes to, 20 members into 50 per member comes to 1000. Can I say 1000 rupees, which is current year subscription money, was already received last year? Last year, meaning opening balance sheet, I would have to record this 1000 as liability. In my opening balance sheet, on the liability side, I'll write pre-received subscription 1000. Observe, current year subscription income 50. In that, how much was already received in previous year? 1000. Balance 49 has to be received here. If it is not received, it will become closing outstanding. Let's anyway see it and then write it later. What's after this? Then they told in year 2025, subscription was received in advance from 15 members. So current year 2025, 15 members have paid next year subscription already. So in receipts and payment of 40, 2024, 2026 is also there. How many members? 15 members. 15 members into 50, that comes to 750. So 15 members have paid their share of 50 rupees per member, 750 rupees in advance for the next year. Now only they paid 750. So this 750, whatever is received, will become closing pre-received for 2026. 750. This you should not forget. This I have written as receipts and payment here 750. This 750 is closing liability. In my balance sheet on the liability side, in the closing balance sheet, on the liability side, I would write here, it is that pre-received subscription 750. Pre-received subscription 750 rupees. Received for the year 2026 in the year 2025. I can feel like I'll close my subscription account now. Don't do it. We'll do it later. Go with the order of the adjustments. We'll come back and then close the subscription account later. Municipal taxes is paid on 1st April every year. How much have I paid in municipal taxes during the current year? Come to municipal tax account, 6,000. 6,000 is paid during the current year. It is paid current year. It is paid during current year. Out of this, there is some amount which is paid for next year. How much is paid for next year? 3 months. Because it is paid from April to March, but our year is January to December. When you pay in April 2025, it's paid till March 2026, but year ends on 31st December 25. January, February, March of 2026, we prepaid. How much have we prepaid? 6,000 into 3 by 12. That is 1,500. If you paid 1,500 in advance for next year, last year also we would have paid advance for current year. That is also 1,500. So if you identify balancing figure, 6,000 will become income and expense by income and expenditure. So this is current year income 6. So 6 is paid, expense. But in that 6,500 is paid for next year. And last year we paid 1,500 for current year. 1,500 will appear in opening balance sheet as asset. 1,500 will appear in closing balance sheet as asset. 6,000 I have recorded as expense in my income and expenditure. 6,000 is payment in my receipts and payment. Simple. Come on, let me write 1,500 in my opening balance sheet and closing balance sheet. Opening balance sheet 1,500 prepaid municipal tax. Closing balance sheet 1,500 prepaid municipal tax. And in my income and expenditure, municipal tax expenses is 6,000. We're done with municipal tax. Actually, like I mentioned, there is no need of the ledger account for this. You just have to write 1,500 asset in opening and closing balance sheet. What's after this? One member donated billiards table worth 50,000. So in the balance sheet, on the asset side, I will write one new asset. What is the name of that new asset? Billiards table 50. I did not pay money. If I would have paid, my cash would have decreased. I received it as donation. that will be recorded as donation. Billiard table, donation 50. So it's not my money that I've used to buy. Billiard table became asset because I did not pay the money. That will be recorded on the liability side as donation for billiards table 50. What is the next adjustment? Books were worth 46,000 on 31st December 2025. Closing balance. In the closing balance sheet, books is 46,000. I'll write the same in the books ledger that I've opened. I opened one cute ledger for books. I will write here balance carried on 46. Opening balance of books is 20. Purchases made is 35. Book should become 55, but it is 46. 46 and 55 difference. 4 plus 5, 9,000. Depreciation on books. I should write in the credit side by income and expenditure. And in the income and expenditure, I should write debit side as expense. But I'll not write it right now. We'll do it after we finish all the adjustments. Then we'll close the ledger. Right now, I'm still doing the question in the order of items. What is the next item in the question? After books, they told stock of sports material is 4,000 closing. Okay. Have I opened sports material ledger? I think yes. Closing balance, I'll write on the credit side 4,000. Opening was 4,500. Purchase is 15. Can I say closing sports material should be 19,500? But we have only 4,000. From 19,500, if I deduct 4, 15,500 worth of sports material is sports material consumed, which will become expense in my income and expenditure. But I will not write it right now. I'll write it later in the order of closing ledger. I'll write closing balance of 4,000 sports material in my balance sheet, closing balance sheet as asset. How much is that sports material? Here it is, 4,000. I had written the name, but I had not written the amount. Now I'll write the amount. Next, yay, all adjustments are done. All that I need to do now is very simple. Close one ledger at a time. Income and expenditure will be closed at the end to find the surplus which will be added to capital fund. To find capital fund, I need to close this. But don't close this. First close all other ledgers. Subscription. Simple shortcut for any ledger in NPO. Remember, opening balance, receipts and payment, income and expenditure, closing balance. These are the 4 items that will be there. Opening, closing, R&P, I&D. 3 will be there. 1 will be balancing figure you need to find. In this question, receipts and payment is given. So opening, closing, receipts and payment will be there. Income and expenditure is balancing figure. See here, in this question, 2024 you are supposed to receive 3,000. You received 2,000. 1,000 is still outstanding. 2024 column is closed. Close it year wise when it comes to subscription. 50,000 is current year subscription income. In that, 1,000 was already received. How much is received here and how much is yet to be received? You would have to find it. Very easy to find. Total receipts is 40. In that 2,000 is for 2,000 rupees. Sorry, 2024, 2,000 rupees. 2026, 750 rupees. What belongs to 2025 is 40 minus 2,000. Sorry, 40 minus 2,000 minus 750. How much is that? 40 minus 2, 38. 38,000 minus 750 is 37,250. 37,250 is the extent of money received for 2025 subscriptions. 2025 year, income is 50. In 50, 1,000 was received last year. In 50, 37,250 is received current year. How much is not received? 50,000 minus 1,000, 49,000 minus 37,250. 50,000 minus 1,000 minus 37,250. Can I say that comes to be 11,750 is the extent to which it is not yet collected. So closing outstanding is 12,750. Now check the total of the ledger. It has to tally. Always remember to tally subscription account year wise, not in total. If you do it in total, damar. Year wise you total and check the totals, it should match. 41 plus 12,750 is 53,750. Here also you get 53,750. This 12,750 closing balance sheet asset. In my closing balance sheet, I would write subscription outstanding 12,750. And I've already written 750. I've already written 3. I've already written 1,000. See, 1,000 and 3 already written. And here also I've written 750, 12,750. Income for the year is 50. That 50 is also written in income and expenditure as subscription 50. By this, I've closed my subscription ledger. It's tallied. Then come to furniture. 10 plus 15, 25. 25 minus 5, 20,000 is closing balance. Sir, depreciation, they have not given. So assume that there is no depreciation. They have not given, so assume that there is no depreciation. Furniture closing balance 20. In my balance sheet, which is closing, I'll write furniture. How much? 20. Furniture done. Then next ledger, sports material. 4,500 plus 15, 19,500 minus 4. You will have 15,500 as consumption of sports material. Consumption of sports material in sports material account are written by income and expenditure. In income and expenditure account, I would write to sports material consume 15,500. By this, I'm done with sports material. Sports material ledger is also closed. Come to books. Opening balance of books 20. Purchased 35. Together 55. 55 minus 46. 4 plus 5. 9,000 is like depreciation on books. In books account, I've written by income and expenditure. In income and expenditure account, I would have to write to depreciation on books 9,000. By this, I've closed my books account also. Come down. We're done with subscription ledger. We're done with furniture ledger. We're done with sports material. We're done with books. Then come to municipal taxes, which is already done. Everything's done. Last working note account to be closed. Basically statement. Balance sheet. Identify capital fund. 10 plus 20, 30. 30 plus 125, 185. 185 plus 4,500 plus 2 lakh plus 7,500 plus 3,000 plus 1,500. 3,71,500. From that, deduct 3,500. You get 3,68,000 as capital fund. 3,68,000 is opening capital fund. In my closing balance sheet, I'll write 3,68,000, whatever I found here. Now I need to add my current year surplus or deduct my current year deficit. How do we get that? Income and expense. Come to income and expense. 20,000 plus 2,500 plus 50 becomes 72,500. From 72,500, deduct 14, 9,500, 5,000, 10,000, 6,000, 15,500 and 9,000. You will get surplus as 3,500. This surplus of 3,500 will be added to capital fund here. To 3,68,000 plus 35 plus 10 plus 3,500. You will end up getting 4,16,500 as my capital fund. 4,16,500 plus 15. Here 48. Opening match fund is 0. 48 minus 40 minus 28 is 12. Opening building fund is 0. So building fund total is 45. Take the totals. 4,16,500 plus 15 plus 12 plus 45 plus 750 plus 50,000. 5,39,250 is liabilities. Assets 20 plus 46 plus 125 plus 2 lakh plus 80 plus 4 plus 1,500 plus 50 plus 12,750. 5,39,250. By this, the balance sheet tallies, and this is the end of accounts of our not for profit organization. Let's now solve question number 11 from our Jan 2026 RTP for CA Foundation Accounting. This question number 11 is on the topic of incomplete records, or what we call as single entry system. This is about Deep Enterprises, who maintains its books of accounts under single entry system. They've given the balance sheet, though it's still something that we can call as statement of affairs if they're still following single entry. We can call this balance sheet only if they've converted the single entry records to double entry records in the previous year. Let's come to the end of the question. Let's see what have they given us and what are they asking from us. Following is a summary of cash book and bank book. Okay, they've given previous year balance sheet, they've given cash book, bank book details, they've given a lot of adjustment relating to discount allowed to trade debtors and received from trade creditors. I'll make a marking in my previous year balance sheet. There is an adjustment regarding trade debtors. There is also an adjustment regarding trade creditors. I'd open a ledger for trade debtors and trade creditors to adjust this. Then there is an adjustment on fire insurance premium, and next to fire insurance premium, which is paid, prepaid is there in the previous year, and in the cash book also there should be some payment. There is, I think it's part of sundry expenses. I'd include them all and then prepare one cute ledger to identify the expense for the year, including fire insurance premium. What else do we have after this? Furniture and fixtures is to be depreciated at 15%. In my balance sheet, I would mark furniture and fixtures. This I would depreciate. Then We have stock. This is closing stock, which would come in trading account credit side as well as balance sheet asset side. Trade debtors is available. We'll open a ledger for debtors, and this outstanding expenses will come as a part of the ledger that will open for expenses, including the fire insurance premium, opening prepaid, closing prepaid. All of that will get sorted in the same ledger. GP is to be maintained at 10% on total sales, and they want us to prepare trading, P&L as well as balance sheet. So this is a clear-cut question of conversion of incomplete records to double entry system. That is conversion of single entry to double entry. We'll open trading PL balance sheet. Add-on will be the ledgers which is required based on the adjustments in the question. Come, let's begin from the start. Start from the beginning. Take these items and write it to the respective place. Capital, whatever is given in the opening balance sheet will go to our closing balance sheet. This is trading PL followed by balance sheet of Deep Enterprises. On the liability side in the balance sheet, I'll write capital 3,37,500 taken from the opening balance sheet on the liability side in the inner column, being written in the inner column for a reason that we'd have to deduct drawings if there is any, we'd have to add net profit if there is any, and then we'll identify the closing capital balance. What do we have after that? Next we have with us trade creditors. I'll open a ledger, write 3,78,750 as opening balance. This is my trade creditors ledger because it is a liability. Opening balance of 3,78,750 will come on the liability. I'm going to say the credit side. Then outstanding expenses. I'll open another ledger for expense. Outstanding expense being a liability, it will be written on the credit side by balance brought down 33,750. Expense account by balance brought down 33,750. Later I'll write the expense paid, prepaid if there is any, closing outstanding, and then I'll find the current year expense as balancing figure to be posted to P&L account. What do we have after expenses? Then we have furniture and fixtures. This is my asset. I would write it in my balance sheet on the asset side. Furniture and fixtures to the extent of 75. It is in the inner column because I would have to deduct depreciation on the same. What do we have after 75? Stock of 4,57,500 is actually opening stock. It will go to our trading account on the debit side. I'll take you all to my trading on the debit. Opening stock 4,57,500 rupees. Done. What do we have after that? After opening stock, we have trade debtors 1,56,000. Trade debtors of 1,56,000. I'll open a ledger called trade debtors. Debtors being asset, I'll write on the debit side to balance brought down 1,56,000. Then prepaid insurance. It is asset, and asset opening balance will be written on the debit side in the same expense ledger. I would write 1,500, or you can choose to open a new expense ledger called insurance premium account. I would write it in another one. Insurance premium account. On the debit side, I would write balance brought down 1,500. Then cash in hand 60. I don't have to open cash and bank account because it's already given. Whatever 60 is given here as the opening cash balance is already taken here in the debit side as opening balance. I'll take care of all other receipts and payments and then post them to the respective ledger. Come on, let's go to the next one. We're done with this. I'll go to the payment slightly later. I'll finish the receipt side. Then I have with me cash sales of 55,35,000. Cash sales would appear in the cash account on the debit because cash is received and that's a receipt. And I would have to write this in my trading account on the credit side under the heading sales. Sales is two things in my trading account. One, cash sales. Second one, credit sales. I right now know my cash sales is 55,35,000. That's what is given here. I would write credit sales later once I close my debtors account. When I close my debtors account is when I'll find my credit sales. Then I have here receipts from trade debtors 13,87,500. When the money is received from debtors, the journal entry is cash or bank account debit to debtors. In my cash or bank account, it's already written on the debit side to debtors. In my trade debtors account, I'll write on the credit side by cash 13,87,500. By this, I've finished the receipt side of my cash book. Now I'll come to the payment side. To begin with, I have payment to trade creditors 62,41,500. I've already opened a ledger called trade creditors account. When I make payment to creditors, the journal entry is creditors account debit to bank. In bank account, I've already written by trade creditors. In trade creditors account, I'll write debit side to cash or bank account 62,41,500. Once I read the closing balance of creditors, I'll find the credit purchases as balancing figure here and that would go to my trading account as purchases. What do we have after this? We do have sundry expenses paid to the extent of 4,65,525. Entry is expense account debit to cash. In cash account, I written by expense. In expense account, I'll write to cash. How much is paid? 4,65,525. Then drawings to the extent of 1,80,000 is reduction of capital, and it also reduce your cash. Journal entry is drawings account debit to cash. So in the cash account, I've written by drawings, and now drawings has to be deducted from capital. I'll go to my balance sheet. Capital, which is staying in the inner column, from that I would deduct drawings of 1,80,000. What do we have after this? We finally have closing cash balance of 95,475. This is my asset. I would write in my balance sheet as asset 95,475, and it is part of my cash and bank account on the credit side as closing balance. That is anyways written. I'll write this here. By this, I'm done with my receipts and payment or cash book also. Now I have this 1, 2, 3, 4, 5 adjustments to take care of. Once I take care of them, I am actually done with my trading P&L and balance sheet under incomplete records. Let's see. Discount allowed to trade debtors and received from trade creditors amounted to 27 and 21,250. Discount allowed is 27,000. Discount received is 21,250. Let me now focus on discount allowed. When I allow discount, my debtors will decrease. So debtors account will be credited. Discount allowed being expense, it will be debited. Journal entry is discount allowed account debit to trade debtors. In my trade debtors account, I'll write by discount allowed 27,000. This being expense, this will be later transferred to PL. Entry is P&L account debit to discount allowed. So in my P&L account, this is my trading till here, and this is my P&L account here. Here I would write to discount allowed 27,000. Similarly, we have received discount of 21,250. 21,250 discount received is income, and my liability creditors is reducing. Creditors is a liability reducing, debit creditors. Discount received is an income, credit discount received. Journal entry would be creditors account debit to discount received. So in my trade creditors account, I'll write to discount received 21,250. I'm not opening discount received ledger, but the following entry is discount received account debit to P&L. That is to transfer the discount received income to my P&L. So in my profit and loss account, on the credit side, I would write by discount received 21,250 rupees. Discount received income credited in PL. What do we have after that? Annual fire insurance premium of rupees 4,500 was paid every year, but it is paid on 1st of August every year. So when I pay on 1st of August, I'm paying for the period starting 1st of August till 31st of July next year. However, my year ends on 31st March. I paid it from August 1st to 31st July, but my year ends on 31st March. So I paid for April, May, June, July, 4 months prepaid. So I paid 4,500, and that 4 months amount is prepaid. So 4,500 into 4 divided by 12 is prepaid insurance amount. Let me take it. In my insurance premium account, on the debit side, I would say not two cash. I'll write two expenses. I paid 4,500. In the expenses, whatever 465, 525 is paid, in that it already includes insurance of 4,500. I'll eliminate it from expense and I'll write it in my insurance premium. So opening prepaid was 1,500. I paid last year also in August, but this year I'm paying in August again. So when I paid in August last year, it was till July end this year, meaning this year's April, May, June, July, 4 months of insurance premium was actually paid last year only. Same thing, yeah. Whatever is closing prepaid will be opening prepaid. Anyways, let's check. Observe. Balance carried down. So we paid from this August till next July. My year ends in March. So April, May, June, July. 4 months of insurance premium I paid in advance. 4,500 into 4 by 12 comes to 1,500. So last year I paid 1,500 of this year. This year I'll pay 1,500 of next year. So opening prepaid, closing prepaid will match. This 1,500, whatever is there here, closing prepaid, will appear in my balance sheet as an asset. Prepaid insurance 1,500. Same 1,500 is there in last year balance sheet also, if you observe. Same 1,500 is there in last year balance sheet. Same 1500 will be there in this year balance sheet also. Later I'll close my insurance ledger to find profit and loss, but don't close any ledger now. Keep all the ledgers open. Once you finish all the adjustments, only then go to closing the ledgers. The next item that I have, furniture and fittings were subject to depreciation at 15% per annum. Let's depreciate furniture and fittings by 15%. Come to balance sheet. Balance sheet, furniture and fittings 75,000. Less depreciation at 15%. 75,000 into 15% is 11,250. From 75,000 deduct 11,250. You will get 63,750 of furniture and fixtures, and 11,250 whatever is depreciation expense should be written in our P&L account on the debit side as expense. I would write here depreciation on furniture 11,250. The journal entry is depreciation account debit to furniture, then P&L account debit to depreciation. I hope you all got this. What do we have after that? Closing stock 4,87,500. In my trading account on the credit side, closing stock 487,500. Further, this being asset, it should be written in my balance sheet on the asset side, stock 4,87,500. Next item, trade debtors closing balance 1,71,500. Same thing. I would write in my balance sheet as asset 1,71,500. Next, in my trade debtors account, I would write by balance carried on 1,71,500. I'd find my credit sales as balancing figure in my trade debtors account, and that credit sales will appear in my trading account on the credit. Find the total sales, using which I'll find GP as a percentage, and then GP will help us find NP, NP will help us find closing capital, which will ensure balance sheet will tally. Let's proceed. What's after trade debtors? Outstanding expense 27,600. This much of expense is yet to be paid. In our balance sheet, it's liability. Trade expenses or outstanding expenses 27,600. In my expenses account, it being a liability which has closing balance, it will be written on the debit side to balance carried down 27,600. What do I have after that? Gross profit is maintained at 10%. That's it. All the information is there. Now I'll close one ledger at a time and then find GP like I mentioned. So don't touch trading, don't touch PL, don't touch balance sheet, come to trade creditors. There is opening, there is cash, there is discount. Two things are missing. One, balance carried on is missing. Two, purchases is missing. So creditors ledger cannot be closed. Why? There are two things to be found. One, closing creditors, which is not given in the question, unlike debtors. They have also not given us credit purchases. So because two items are missing, I can't close this ledger now. I'll keep it pending. We'll close it later. Then come to expenses. We have opening, we have closing, we have paid, we have insurance, everything. Balancing figure will be PL. Total on the debit 493,125. Total on the credit 493,125. Balancing figure is current year expense by P&L 4,54,875. In expense account I written by PL. In P&L account I'll write two expenses 4,54,875. Come to P&L account. On the debit side I'll write two expenses 4,54,875. This becomes my expenses for the year. Paid, not paid, I don't care. Expense. So by this, trade creditors account is not closed, but expense is closed. Come to trade debtors. There is opening, there is discount, there is cash, there is closing balance. Missing figure is sales. Shall we find sales? It's simple. 13,87,500 plus 27 plus 1,71,500 comes to be 15,86. From that, if I deduct 1,56,000, I'll get I'll get sales of 14,30,000. This is not total sales. This is only credit sales. If I write this 14,30 in my trading, add it with cash sales, then I'll get closing sales. So then I'll get total sales. Let me take 14,30,000 to my trading account. Write credit sales as 14,30,000. I'll get 69,65,000 as total sales. Now we know we couldn't close our creditors account because we knew opening, we knew discount, we did not know purchase as well as closing. Now in trading account, I have opening, I have sales, I have closing. On sales, if I put GP percentage, I'll get GP. I have everything in my trading except purchase. I'll find purchase as balancing figure. And there can be cash and credit both, but in this question there is no cash purchases. Why? If it is cash purchase, goods are purchased and cash is paid immediately. If the cash is paid, it will appear in my cash account on the credit. They have given cash and bank account and nothing on the credit side, meaning nothing is paid. So entire amount can be taken care of. Let's say entire amount is credit purchases only. That will go to creditors account and we'll find closing creditors as balancing figure there. Shall we do that? Help me. How much is gross profit? 10% of sales. That is 69 lakh 65. Can I say 6 lakh 96,500 is GP? Total on the credit becomes 74,52,500. I'll write the same on the debit. My purchase is balancing figure, and I have no doubt that this purchase is obviously credit purchases only. Like I mentioned, there can't be cash purchase. Sir, what if there is cash purchase but they did not pay money? If they don't pay money immediately, that becomes credit purchase. And I would write here GP brought down to the extent of 6 lakh 96,500, and let me write purchases of 62 lakh 98,500 in my creditors account on the credit side, because the journal entry is purchase to creditors. In creditors account, I have to write by purchase. I have everything in my trade creditors. I can close this now. 66 lakh 77,250 total on the credit. If I write the same on the debit, I'll get balancing figure, closing balance 4 lakh 14,500. This being my trade creditors closing balance, I'll post this to my balance sheet liability side as 4 lakh 14,500 rupees. I'm done with my trade creditors. I'm done with my expense. I'm done with trade debtors. Last ledger to be closed, insurance premium. I have opening, I have payment, I have balance carried down. Balancing figure will be PL. 6,000 debit, 6,000 credit, 4,500 balancing figure is the current year insurance premium expense to be transferred to PL. In insurance premium account, I have written by PL. In P&L account, I will write insurance premium 4,500. Everything's done. GP is also brought to PL. What should I do? Total the credit side, write it on the debit side, identify net profit. 696,500 plus 21,250 gives us 7 lakh 17,750 as the total on the credit. If I write the same on the debit, my gross profit plus discount received minus discount allowed, depreciation expense and insurance expense, which gives me net profit of 2,20,125. This 2,20,125 of net profit will be added to my capital. 3,37,500 is my capital. 1,80,000 is drawings deducted. 2,21,25 is net profit to be added. We'll get the closing capital as 3,77,625. To this 3,77,625 capital, if I add 27,600 and 4,14,500, I'll get total on the liability side as 8,19,725. And on the asset side, if you do 63,750 plus 95,475 plus 1,500 plus 4,87,500 plus 1,71,500, you get total on the asset side as 8,19,725, which tallies our balance sheet. And this is conversion of single entry into double entry system. Solution to our question number 11. Trading PL, balance sheet, creditors and expense ledger, debtors and insurance premium, and that's the end. Let's now start question number 12 from our Jan 2026 RTP for CA Foundation issued by the institute. And this question number 12 is on partnership accounting, but they've not asked you to do a full-fledged revaluation, partners capital, and then cash or bank account or balance sheet based question. This 12th one is on computation of goodwill. Let's quickly solve this. Sita, Geeta, and Rita. There are 3 partners. They're in partnership sharing profits as well as losses in the ratio 2:5:3. So it is 2 plus 5, 7, 7 plus 3, 10. So Sita is getting 2/10, Geeta is getting 5/10, and Rita is getting 3/10 of the profits of the company, of the profits of the partnership firm. The balance sheet of the partnership as on 31st of March 2025 is given. What do they want you to do? Partnership earned profit of 6 lakh during 24-25, and partners have withdrawn 4 lakh 50 during the year. Normal rate of return is 30%. They want you to find the value of goodwill on the basis of 5 years purchase of super profit. Oh, they want you to compute goodwill under super profit method. Under super profit method, goodwill is computed like this. super profit multiplied by 5 years purchase. So the goodwill formula is goodwill is equal to super profit multiplied by number of years purchase, which in this case is 5. In this question, number of years purchase that we're taking is 5 because it's mentioned in the question. What does this number of years purchase signify? Number of years purchase signify the period for which the customer will come back to the same business, because of which you get to sell, because of which you get to earn profit. Right now we don't know super profit. Then we'd have to compute super profit. Super profit is computed as adjusted average profit or future maintainable profit minus normal profit. What is the profit that everybody earns? And what is the profit that I earn? Whatever I earn more than what others earn is super profit. If others can earn 10,000 rupees every month, if I earn 12,000, that 2,000 extra what I earn is my super profit. This super profit, whatever I compute for a year, multiplied by number of years for which I can continue to earn that extra profit more than my competitors is my goodwill. So I'll first see how much profit is everybody in the industry earning, how much of the profit am I earning, how much am I earning more than others will become my super profit. That super profit multiplied by how many years can I earn more is number of years purchased. Once I multiply, I'll get goodwill. Next, how to find adjusted average profit? Adjusted average profit in the present question, they've told you to, okay, normal profit is to be found based on average capital employed. Adjusted average profit is the current year profit. They would have given current year profit, say 6 lakh. That is the adjusted average profit. There are no adjustments. 6 lakh is the adjusted average profit. Then we will find super profit as adjusted average profit, which is 6 lakh minus normal profit. How are we going to compute normal profit? Normal profit is capital employed multiplied by normal rate of return. What is the capital that I have employed multiplied by the rate of return everybody gets? So how much capital have I invested multiplied by rate of return what everybody in the industry is earning? If I multiply, I'll get normal profit. If I'm earning more than that normal profit, that is super profit. And to compute that normal profit, I told you we need to do capital employed multiplied by NRR. NRR in the question is 30%, but capital, they don't want you to take closing capital. They want you to consider average. How do we find average? Opening plus closing divided by capital is found as opening plus closing divided by 2. How do we find opening? How do we find closing? What is the relationship? Opening capital plus profit earned during the year minus drawings is equal to closing capital. I'll repeat, opening capital plus profit earned during the year minus drawings is equal to closing capital. In the question, they have given one balance sheet. In this balance sheet, whatever capitals are there, this is closing capital. And we know drawings, we know profit. So opening profit, we do opening capital, I don't know. So that if I add profit and deduct drawings, I'll get closing. I'll work it backwards and find opening. Then I'll do opening plus closing by 2. There's also another method to do it. I'll show both the methods to you. So average capital employed is found as opening plus closing divided by 2. I know my closing capital, I don't know opening capital. Observe. Opening capital, which I don't know. To this, if I add, I don't know Sita, Geeta, Rita, none of their opening capital I know. To this, if I add current year profit and deduct the drawings made during the current year, I'll get my closing capital. Closing capital, Sita, Geeta, Rita. This I know. It's given in the question. 2 lakh 55, 9 lakh 45, 6 lakh 75. I'll write it 2 lakh 55, 9 lakh 45, 6 lakh 75. If I add all of them, I get 18 lakh 75,000. 18 lakh 75,000 is my closing capital. I don't know my opening capital. But I know profit earned during the year is 6 lakh, drawings made during the year is 4 lakh 50. So there is a number so that if I add 6 and deduct 4 lakh 50, I'll get 18 lakh 75. So instead, take 18 lakh 75, add 4 lakh 50 and deduct 6 lakh, you'll get opening capital as 17 lakh 25,000. This is found as balancing figure. If you want to check cross verify now, take 17 lakh 25,000 opening capital. So that you add 6 lakh, from that you deduct 4 lakh 50, you'll end up getting 18 lakh 75,000. This is how closing capital is formed. And they've asked us to not take closing capital, but they've told opening plus closing divided by 2, average 17 lakh 25 plus 18 lakh 75 divided by 2. That's how I'll find my average. 1725 plus 1875 divided by 2 This gives me average capital employed of 18 lakh, which is 36 lakh divided by 2. This is one way of finding average capital. I can compute the entire average capital in a different way. See, average capital is capital in the middle of the year, or capital on an average that's there during the year. I'll do opening less profit minus drawings to find closing, and opening plus closing divided by 2 will be average. Instead of taking opening, adding full profit, deducting full drawings to find closing, why don't I add half the year's profit, deduct half the year's drawing and find the average? So average can be found either as opening plus closing divided by 2, or opening capital plus half the year profit minus half the year drawings. In this question, we don't know opening, no? So using closing, how do we do it? Simple. From closing, deduct half year profit, add half year drawings. To opening, less half profit minus half drawings, or to closing, minus half profit plus half drawings will give you average. I'll show you how it works. I'll take closing capital of 18,75,000, what we know, that is 255 plus 945 plus 675 total. From this, I'll deduct half the year's profit. Current year profit is 6 lakh. I'll deduct half of it, 3 lakh. I'll add half of the drawings, which is 4 lakh 50 by 2, 2 lakh 25. This is how I'll get my average capital. Actually, this is not opening. Average capital employed is 18 lakh. So you can do one simple table like this, or you can do these two big tables, all to find average capital employed of 18 lakh. If your average capital employed is 18 lakh, normal profit can be found as average capital employed of 18 lakh multiplied by 30% NRR given in the question. Normally, based on the capital that I have employed, if I get 30% return like everybody in the market, like a normal person, I should make profit of 5 lakh 40. But I am actually making profit of 6 lakh. So over and above 5 lakh 40, I made a profit of 60,000. This 60,000 is my super profit. And I believe this extra profit, 60,000, more than others like 5 lakh 40, what I made as 6 lakh, the 60,000, I believe that I can make this extra profit for 5 more years. So 60,000 multiplied by 5, 3 lakh rupees of the profit that I'll earn in the future is because of my today's goodwill. So the goodwill of Rita, Geeta, Sita partnership firm is rupees 3 lakh based on super profit method at 5 years purchase, keeping 30% as NRR based on the average capital employed. This is how you should have got 3 lakh. And I'll scroll the answer bit by bit so that you can check if you already tried this. And then finally this. And this average capital employed, I also computed it like this. We'll now solve question number 13 from our RTP January 2026 for CA Foundation Accounting. This question number 13 is from the topic of partnership, the last unit in partnership, that is dissolution of partnership firm. Let's quickly begin. See what's happening here. A, B and C are partners. Very good. They're sharing profits and losses in the ratio of 2:2:1. 2 by 5, 2 by 5 and 1 by 5. They've given balance sheet before dissolution. Firm dissolved on 31st of March. That is the date on which the balance sheet is prepared. After preparing the balance sheet, it was discovered that purchases to the extent of 20,000 in March 2025, that is before the balance sheet date, were not recorded in books. This is clearly an error of omission. We have to debit purchase and then credit creditors. I need to increase my creditors. I need to increase my purchases. But purchases cannot be increased now because we're on the verge of dissolution. And that would have decreased our profit. Profit decrease is nothing but decrease in capital. So debit capital of the partners in their PSR and credit creditors to the extent of 20. This is rectification of errors after final accounts. So basically you would have written P&L adjustment to creditors, and later that P&L adjustment would be closed by transfer to capital. You learned this in rectification. I am doing the same thing in partnership. Then fixed assets realized value is given, stock realized value is given, debtors realized value is given, creditors were paid after deducting discount of 2%. There is a similar question in our ICAI study module on the topic of dissolution, but there is a small variation in the answer. There was no adjustment with regard to this extra 20,000 credit hours payment. But here, we'd have to pay that extra credit hours 20,000. That's the answer given in RTP. Let's anyway stick to the same. Then the realization expenses amounted to 5,400. Okay, let's take care of that. Let's write that in realization account. And A took over Mrs. A's loan and B is insolvent and could not bring anything. Because B could not bring anything, A and C might have to compensate for B's loss in their capital ratio. That's Garner versus Murray. And they've asked us to do realization account, partners capital account, and cash account applying the principles of G versus M, which means the partnership deed between A, B, and C does not talk about how to handle insolvency of the partners. So we're applying Garner versus Murray. Let's start. पहले से शुरू करते हैं माय गॉड कैपिटल्स हाउ मच A B C 1,46,000 54 and 50. These three I'll write in my partners capital account on the credit side. I opened two partners capital account, one for rectifying that purchases, second one is rectified capital for closure purpose. So I'll write before rectification balance is 1,46,000 54 and 50. Good. Then we have C's loan account of 25,000. C's loan, that is partner's loan, should be paid after we pay outside liabilities, but before we pay partners. In my cash account, I'll write C's loan 25,000. I'm paying it right now, but actually the order of payment is not now. I would have to first pay outside liabilities, then I should pay partner's loan, then pay partner's capital. I'll anyways pay, so I've written it now. You can decide to write it not in your cash account and then remember to write it after you pay outside liabilities. Anyways, the ultimate treatment will come down to be the same thing. What do we have after this 25? Mrs. A's loan 50. We read no, Mrs. A's loan is taken over by Mr. A. So in my post rectification partner's capital, which I'll bring down here, I would write Mrs. A's loan of 50,000 as taken over by Mr. A, the partner. What do we have after this 50? Then we have sundry creditors to the extent of 1,25,000. Sundry creditors in my realization account, I would have to take it over because it's a liability. It has to be debited. Entry is creditors account debit to realization. In realization account, I'll write by sundry creditors 1,45,000. And Mrs. A loan I can skip or I can write it here and then I can also write that it is taken over by the partner. I can skip it completely or I can write it in realization account on the credit as liability to be closed by transfer to A's capital. Either ways, it's the same. What do we have after that? Then we have provision for bad debts 25,000. Close it by transfer to realization. Because it's a liability, it should be debited and realization account should be credited. Journal entry is provision for bad debts account debit to realization. In realization, I'll write by provision for bad debts 25,000 rupees. What do we have after that? Fixed assets to the extent of 2 lakh. This has to be closed by crediting. Journal entry will be realization to fixed assets 2 lakh. And for stock, entry will be realization account debit to stock 1,25,000. For debtors, same again, realization account debit to debtors 1,25,000. And finally, for cash, entry will be in my cash account. I would write on the debit side to balance brought down 5,000 rupees. What do we have after that? Advance to B. So this is like the debit balance in partner B's capital account. I would write this as balance brought down on the debit side in the rectified partner's capital account with rectified balance, debit side 20,000 balance brought down. Then by this I'm done with the partner's capital as well as all the assets and liabilities from the balance sheet. Now we'll go to post balance sheet data. Firm is closing on 31st March. We are doing liquidation on 31st March. 20,000 purchases have been not recorded. We'd have to now make the entry. Purchase account should be debited. Creditors account should be credited. This is to the extent of 20. But already the balance sheet is prepared. Now I'm rectifying it post balance sheet. As the error is identified after final accounts, purchase account will be replaced with P&L adjustment account, which should be later transferred to capital. Instead, I'll write the entry as partners capital account debit to creditors 2020. Which partner will you debit? All the partners capital account in their profit sharing ratio. What is their PSR? We read it 2:2:1. So I'd have to do 2/5, 2/5, 1/5,
for 20,000. It will be 20,000 into 2 by 5, 20,000 into 2 by 5, 20,000 into 1 by 5, which comes to be 8, 8 and 4. I've done the rectification to the capital. We'll get the revised capitals now. The revised capital after rectifying that purchase entry which was omitted will be 146 minus 8, 138, 54 minus 8, 46, 50 minus 4, 46. This will be balance carried down in the balance brought down in the post rectification partners capital account. I decreased my capital by recording creditors. Now I'd have to increase my creditors also, but I won't have to do that separately. When I pay them, I'll end up paying them slightly more. I hope you guys got that. Current sundry creditors was 125. I've already recorded 145. That is 125 of my sundry creditors plus 20,000 which was previously omitted, now recorded. So this is, I forgot to mention it some time ago. I hope you people understood. 1,20,000 from balance sheet, 25,000 now the increased sundry creditors balance because of recording that unrecorded purchase. That's how I have transferred 1,45,000 to my sundry creditors. Then what is the next item that we have? Fixed assets realized 1 lakh, stock realized 1 lakh 5, debtors realized 1 lakh 2,500. All these realizations is cash received. The journal entry will be cash account debit to realization. In my realization account, I'll end up writing by cash or by bank. How much did I realize from fixed assets? How much from stock? How much from debtors? Amounts are 1 lakh, 1 lakh 5 and 1 lakh 2,500. 1 lakh, 1 lakh 5 and 1 lakh 2,500. All three put together, it comes to 3 lakh 7,500 rupees. In my realization, I've written by bank. In my bank account, I would write on the debit to realization fixed assets, stock and debtors. The 1 lakh rupees, 1 lakh 5 and 1 lakh 2,500. Put together, it is 3 lakh 7,500 rupees. What do we have after this? Creditors were paid after a deduction of 2% discount. So how much am I paying my creditors? My creditors as per balance sheet was 1,20,000. After recording that missed out purchase 25, my creditors have now become 1,45,000. When I'm supposed to pay them, I have been offered discount of 2%. So when I pay, the journal entry will be creditors to bank, which will now be recorded as realization to bank, which is 1,25,000 plus 20, which is 1,45,000 minus 2%, which is 1,42,100. In my realization, I've written to bank. In my bank or cash account, I'll write by realization, creditors paid 1,42,100. Change this as bank and cash account. Next, realization expenses amounting to 5,400 are paid. When you pay realization expense of 5,400, entry is expense to cash, but any expense arising in the process of realization will be debited to realization account. So the journal entry will be realization account debit to cash or bank. In realization account, I'll write to cash or bank, which is already written. I'll write once again. Realization expense 5,400. In realization account, if I write to bank, in cash or bank account, I'll write by realization expenses paid 5,400. What do we have after that? A agreed to take over the loan of Mrs. A, already done. B is insolvent and cannot contribute anything. So it should be borne by A and C. In what ratio? Not in the profit sharing ratio, but in the capital ratio, because we are applying Garner versus Murray, because the loss is not revenue loss, the loss is capital loss. What do we have after this? That's it. Everything else is done. All the assets, fixed assets, stock, debtors is sold. All the liabilities have been taken over or settled. Mrs. A's loan is taken over by A. Sundry creditors has been paid. Identify realization profit or loss. The total that I'll find here is more on the debit side. I would take 6,47,500, write the same on the credit and find realization loss as balancing figure, which comes to 1,20,000. This will be shared between A, B and C in 2:2:1 ratio. 1,20,000 into 2 by 5, 2 by 5, 1 by 5. Sorry, 1,20,000 into 2 by 5, 2 by 5. 1 by 5. This comes to be 48, 48 and 24,000 as my realization loss. In realization account, I have written by partners capital. In partners capital account, I will write to realization account 48,
48 and 24. This realization loss. Now, if you want to check, no, my A has a positive balance. C has a positive balance. There is still balance carried on. But if you look at B, B has advance of 20. He's taken advance of 20. He owes the firm. And there is loss of 48. 68,000 is the debits in his capital, but he has only 46,000 capital. B has to bring in money for A and C to withdraw. But B is saying, sorry boss, I don't have any money. I can't bring any. So there is deficiency in B. B had to get money but is insolvent. His private estate is not sufficient to pay his private liabilities. How can you bring it to the firm? So B cannot bring money. When B doesn't bring, it is loss or deficiency of B to be borne by A and C, which is similar to the case of Garner versus Murray, the case law, where the judgment was that insolvency of the deficient partner or deficiency of the insolvent partner has to be borne by the solvent partners with credit balance in their capital account in the capital ratio. So let's do that. Now, before we do that, we'd have to first ask our solvent partners to bring their realization loss in cash. A will bring realization loss of 48,000 in cash. C will bring the realization loss of 24,000 in cash. In my partner's capital account, I've written by cash. In my cash account, I'll write two partners' capital. Realization loss bought in cash by A and B, 72. And now the insolvency of B is 68 minus 46, which is 22. This will be borne by A and B. If A and C, B was supposed to bring in cash. If it would have bought in cash, there would have been no problem. Because it doesn't bring. This is insolvency of B to be borne by A and C. So B's column is credited because B doesn't have to bring this much. And this 20,000 will be now debited to A and C in capital ratio, which is 138 divided by 138 plus 46. A's capital is 138. B's capital is 46. 138 plus 46 is 184. So I'll do 22,000 of deficiency of B multiplied by 138 divided by 184 gives me the share of deficiency to A because of B's insolvency, 16,500. Similarly, I'll do same 22,000 multiplied by C's capital of 46 divided by 184 and you get C's share of insolvency coming because of B's insolvency is 5,500 or C's share of B's insolvency 5,500. If you add 16,500 and 5,500, that comes to be total of 22. It's all done now. I need to find the closing balance in A and C's capital account now. A, I'll take the total 236 credit, 236 debit. Balance that should be paid in cash to partner A comes to be 1,71,500. Similarly, if you observe for C, it is 40, 20, 60, 70,000 minus 24 minus 5,500 comes to be 40,500. So 1,71,500 is to be paid in cash to partner A and 40,500 should be paid in cash to partner C. In partner's capital account, I have written 2 cash. In cash or bank account, I'll write by partner's capital A and C. B won't pay C. This is 171,500. This is also C. How much is paid to A? 171,500. How much is paid to C? 4,500. Together we paid 2,12,000. And this should actually close my bank and cash account. If it does correctly, that means my preparation of dissolution is correct. 3,07,500 plus 5 plus 72,000 is 3,84,500. 25,000 plus 1,42,100 plus 5,400 plus 2,12,000 will also give me 3,84,500. And by this, I've successfully closed my cash and bank account. Observe, realization account, partner's capital account before rectification, partner's capital account post rectification, continued into my cash or bank account. Lastly, we have with us the adjustment of that transaction which was previously omitted. Let's now start with question number 14 from our RTP issued by the Institute for Jan 2026 examinations of CA Foundation Accounting. This question is on company accounts the second unit, which is basically issue of shares with application allotment, calls in advance, and all that. Let's start reading this. Green Rock Limited, that's the name of the company. It has an authorized capital, there is a maximum limit, nominal capital of rupees 4 crore in equity shares of rupees 10 each. This is ignored, okay? This is not part of your answer anywhere unless they ask you to prepare notes to accounts of share capital. If they'll ask you to prepare notes to accounts of shareholders fund and share capital, then you will disclose this only. They've told of which 30 lakh rupees worth of shares have been issued and fully paid on 30th June. There's nothing that you would have to do about this. Ignore this. The company proposed to make further issue of 2,60,000 shares of rupees 10 each at a price of 1. So this is the key area which is concerned in this particular question. So we are right now issuing 2,60,000 equity shares of rupees 10 each at 12, which means 2 rupees premium on issue. 10 rupees nominal value, 2 rupees premium on issue. Make a note of that. So totally the nominal value of the shares is 10, premium on issue is 2, total price will become 12. That's the issue price. 2 rupees payable on application on 1st of July. On allotment which is made on 10th of July, we are collecting 5 rupees, which includes premium and final call for the balance. So on application, I am collecting 2 rupees with no premium. On allotment, we are collecting 5 rupees including premium. So 5 rupees on allotment, in that 2 rupees is premium, nominal value is 3, balance is on call. So out of 10 rupees per share, if I have collected, out of 10 rupees per share, if I have collected 2 rupees on application, 3 rupees on allotment, my call will be 10 minus 2 minus 3, which is 5. Premium is 0. So I'm collecting 2 rupees on application, 5 rupees on allotment, including premium of 2, 5 rupees on call. Totally nominal value 10, premium 2, total 12. Further, how many shares am I calling for? Don't forget it's 2,60,000. They have mentioned that they've received 8,40,000 applications. Ooh, oversubscription. Applications called for are 2,60,000. Applications received are 8,40,000. Called for 2,60,000, received 8,40,000. There is clearly oversubscription. How are we handling oversubscription? 40,000 shares have received full allotment. So I would say full allotment. Applications 40,000, allotment 40,000. There is no refund, no rejection, no calls in advance. Then for 2 lakh share applications received, 1 share is allotted for every 2 applied. So for 2 shares they applied, I have allotted 1. Applications being 2 lakh. 1 for 2 allotment, if the applications are 2 lakh, allotment will be 2 lakh into 1 divided by 2, which makes it 1 lakh. And further they've told, no money was returned to these applicants. The surplus was to be used for allotment. Surplus was used for allotment. So there is going to be calls in advance in this case. I was just checking if they've kept money till allotment and whatever is excess, are they refunding or are they keeping full money? They're keeping full money. So I was calling for 2,50,000 applications. I have received 8,40,000 applications. Out of them, for 40,000 applicants, I have given full 40,000 allotment. For 2 lakh applicants, I have allotted 1 lakh shares. So 1 lakh worth of application money is calls in advance to be adjusted against allotment money. Then third case, 6 lakh applicants have received an allotment of 1 share for every 5 shares held. So the allotment is 1 for every 5. 5 or 4? 1 for every 5. How many applications? 6 lakh. I'll do 6 lakh into 1 by 5. That comes to 1 lakh 20. For 6 lakh applicants, I have allotted only 1 lakh 20,000 shares. So they've paid a lot of money in advance, no? They're telling the money due on allotment was retained and excess is returned. So from these 6 lakh applicants, to whom I have allotted 1 lakh 20,000 shares, they paid 4 lakh 80,000 applications multiplied by application money. I will not keep the full money with me. I'll keep only 1,20,000 applications accepted into 5 rupees on allotment with me. Excess over and above that will be refunded. So in 1 for 5 category, there is calls in advance and also there is refund. So 6 lakh plus 2 lakh, 8 lakh, 8 lakh plus 40, 8 lakh 40 applications received. Allotment is 120 plus 1 lakh, 220, 220 plus 40, 260. We're done with the applications called for and applications received table. I can go to journal entries which they're asking us the money due on final call was received. So this part I can skip in the working note. But I have to you are required to record these transactions. Basically, I'm supposed to pass journal entries. Before I do journal entries, I will do a detailed working note at application stage and allotment stage as to how much is received, how much is called, how much is excess, how much is shortage, all that. The way I do this working note is slightly different from how the usually working note is presented in ICAI study module. I'm doing this keeping in mind the presentation in the exam. When you printing, you can reduce the font size, you can crush it, you can add an additional table. But when you're writing in the exam, you have to remember you write on pen and paper. You don't have unlimited paper width. You can't reduce the font size and you can't write the numbers in a tilted way, cross way and all that. So I write it in a way in which it looks very lengthy, but it will not take too much time. It's the same thing. Instead of presenting it horizontally, I'll write it vertically. And the language, I don't keep it more like a format. I don't keep it like mug up these 6 items. So I'll keep it more like common sense and logic. And I would strongly recommend you to do this, but if you have something better, you can do it. But I believe this to be the ideal way, which is foolproof, which reduces the possibility of making errors in the exam. That's my belief. You keep your belief with you, I'll keep mine with me. If you trust me, you can follow this. If you trust yourself, do well. All the best. Let's begin. To start with, how many applications were received? In full allotment category, we received 20,000 applications. Sorry, full allotment category received 40,000 applications. Each of them have paid 2 rupees. That becomes 80,000. And in 142 categories, we received 2 lakh applications. Into 2 will become 4 lakh. And 145 category, I have received 6 lakh applications into 2, which becomes 1 lakh. Everything put together, I have received 8 lakh 40,000 applications. I have received 8 lakh 40,000 multiplied by 2 per share, which comes to be 16 lakh 80,000. Out of this, how much money am I keeping? Application accepted. Out of this 40,000, I have accepted full 40,000. 40,000 into 2, 80,000 I will keep. Is there any excess which should be transferred to calls in advance? No, nothing. Is there any refund that I am supposed to make? No. However, in 142 category, they applied for 2 lakh shares and then paid 2 rupees, which became 4 lakh. But I accepted 1 lakh applications of rupees 2 each, which becomes 2 lakh. They were supposed to pay 2, but they've actually paid 4. 2 lakh, whatever they paid extra. Am I going to refund them? No, it will be completely transferred to calls in advance. There is no refund. And in the third category, they paid 6 lakh applications into 2, 12 lakh. And out of that 6 lakh, I've accepted 1 lakh 20,000 applications. 1 lakh 20,000 into 2 is 2 lakh 40. Out of 1 lakh what they paid, I needed only 2 lakh 40. I have 9 lakh 60,000 rupees extra. Am I refunding it? Am I keeping in calls in advance? I'm doing both. Part of it is kept in calls in advance. Part of it is refunded. How much am I keeping in my calls in advance? I'm keeping my allotment money. Allotment money is 1 lakh 20,000 applications accepted into rupees 5 per share receivable on allotment, which becomes 6 lakh. From 12 lakh, if I had collected only 2 lakh 40 towards the shares accepted, 9 lakh 60,000 is extra. In that 9 lakh 60, 6 lakh I have kept it towards allotment. So 3 lakh 60 is the excess to be rejected and refunded. And that's it. I'll just write the totals here, horizontal. And these totals are the amounts against which I'll actually pass journal entry. My first journal entry will be bank to share application 16 lakh 80. Then I'll write share application account debit 16 lakh 80. 2. Share capital 5 lakh 20. 2. Calls in advance 8 lakh. 2. Bank account 3 lakh 60. Quite easy, right? So this working note might look lengthy, but if you are keeping an open mind and then seeing this, this is much better than the working note that you usually see, where just the numbers have been aligned and you would have to mug up format in a specific order. So received 1680, journal entry is bank to share application 1680. I would write my journal entry, bank account debit to share application account 16 lakh 80 on 1st of July. And 16 lakh 80,000 share application account will be debited. I debit it. and I would credit my share capital. To what extent? To the extent of 5 lakh 20. I would credit calls in advance to the extent of 8 lakh. I'll credit bank account to the extent of 3 lakh 60. Observe the entry. 2 calls in advance, 2 bank. Accepted 5 lakh 20. Calls in advance 8 lakh. Bank account 3 lakh 60. 8 lakh, right? Yeah, 8 lakh and 3 lakh 60. That's it. This is the entry for accepting the applications. Now I'll go to allotment. At the allotment stage, I'm supposed to ask for money from each of these. The money that I'm supposed to receive is from 40,000 applicants who have received full allotment. I'll ask them to pay 5 rupees per share, which is 2 rupees towards premium, 3 rupees towards nominal value. 40,000 into 5, 2 lakh. And from this 142 category, I'll ask them to pay 1 lakh share applications which are accepted into 5 lakh. And my 145 category, I'll ask them to pay 1,20,000 into 5, which is 6 lakh. Put together, I'm supposed to collect 13. I can't ask everyone to pay. Why? Because this 142 category and 145 category people have already paid in advance. But my first 2 lakh is there, no? Full allotment guy. He had not paid any advance last time. So he has to pay full cash money received on allotment, 2 lakh. However, 5 lakh, 142 category, this person had already paid advance of 2 lakh. So calls in advance available was 2. Calls in advance utilized is 2. I was supposed to receive 5 lakh from him. 2 lakh rupees I had received in the past, which I'll adjust. So I would have to collect only the balance of 3 lakh from this specific shareholder. Nextly, 145 category, I had to collect 6 lakh rupees from my shareholder, but entire 6 lakh is already available in calls in advance. I kept 6 lakh after computing what is needed in calls in advance only. Full 6 lakh of calls in advance I'll utilize. There is no money that I'll receive from him in cash. So totally I've utilized 8 lakh of calls in advance which was available, and I've collected 5 lakh rupees cash. Totally I had to collect 13 for allotment. I collected 5 lakh rupees cash. 8 lakh rupees I utilized from calls in advance. The journal entry for making share allotment is share allotment account debit to share capital account 13 lakh. Then calls in advance account debit 8, bank account debit 5 to share allotment 13. There is no balance in calls in advance. Everything is utilized. I'll repeat, share allotment to share capital 13. No. You have to split this. There is premium here, 3 and 2. So share allotment account debit 13 lakh to share capital 2 security premium. Then calls in advance account debit 8 lakh to bank account 5 lakh. Sorry, bank account debit, calls in advance account debit, 2 share allotment. It will be the case 8, 5 and 13. Let me write the entry. First I'll make the allotment. I'll write share allotment account debit. I'm supposed to collect 5 rupees for 1 lakh shares. 1 lakh is it? No, it is 2 lakh 60, which comes to 13 lakh. And in that, share capital is 2 lakh 60,000 shares into 3 rupees, 7 lakh 80. To security premium, 2 lakh 60,000 shares into 2. So I'd write here 2 lakh 60,000 shares into 2 per share. This is premium amount. This is the nominal value amount. This is the total amount receivable on allotment stage. I'm supposed to collect 13 lakh, in which 7 lakh 80,000 is towards capital, 5 lakh 20,000 is towards security premium. I would receive money, but not completely. 8 lakh rupees will be taken from my calls in advance, which I had previously created here. 5 lakh rupees worth of cash is received, and my share allotment of 13 lakh is sorted. And in the question they've told call was made and money is received. Call money is 5 rupees per share for 2 lakh 60,000 shares. So the entry is share call to share capital. Before that, interest on calls in advance is to be adjusted. This is something that I wanted to tell. In the RTP solution, they have not written this interest entry, but anyways, we'll still write. You would have to still write. You are expected to do so in the exam. If you observe, on 1st of July, you received the application money where calls in advance was created. This was adjusted against allotment which is made on 10th of July. So, share allotment money received in the form of calls in advance, 8 lakh rupees is received in advance by 10 days. For 10 days at 12% on 8 lakhs, interest has to be paid by the company. Interest is an expense. So interest account debit to bank. It is 8 lakh rupees advance into 12% into 10 by 366. Why 366 and not 365? 2024 is a leap year. February will have 29 days. So they take 366. Interest comes to 2623. Interest expense debit, paid bank account credit. Then let's write that transfer of this interest to P&L. Entry will be P&L to interest on calls in advance, transfer to PL 2623. Then final call, share call to share capital. 2,60,000 shares into rupees 5 per share. Same, 13 lakh, which is duly received. 13 lakh, 13 lakh. Share call to share capital. Last entry is bank to share call, 13 lakh, 13 lakh. Share call money received, and we are done with the accounting entries. I'll show it to you. This is our first working note wherein I've kept all the data that I need. Next, I've done the table for application and then allotment. Call, I'm not doing any table. Call is simple. I'm skipping the table for call because money was asked for, money was received. There is no advance also. Then accounting entry for application and calls in advance and refund. Accounting entry for allotment after utilizing advance money. Accounting entry for final call and the interest part. Let's now start solving question number 15 from our January 2026 RTP of CA Foundation Accounting. This question number 15 is from company accounts, but not the issue unit. This is third unit, which is forfeiture and reissue. Because the shareholder did not pay the money in time. We've given him time, we've given him warning. In spite of that, because he did not pay, we forfeited his share and we've reissued it to somebody. Let's do the accounting for the same. Windy Vale Limited forfeited 900 shares of rupees 10 each, fully called up, held by Varun for non-payment of allotment money of 3 and final call of 4. See this. The shareholder's name is Varun. He holds 900 shares. Share is fully called to the extent of rupees 10. I called for money. He did not pay allotment of 3 rupees. He did not pay final call of 4 rupees. So 3 plus 4, 7 rupees is what he has not paid. The share is 10. In that, if he doesn't pay 7, what he has paid is 3. So 3 rupees was received, 7 rupees is not received. I gave Varun warning. I gave Varun time. I gave Varun notice. Varun did not respond. I forfeited the share. When I forfeited the share capital will decrease. So share capital account will be debited. And the forfeiture is with regard to how many shares? 900 shares. My capital is decreasing to the extent of 900 shares into rupees 10 per share, 9,000. And against this specific shareholder, I had made the call for allotment of 3 and final call of 4, which he did not pay. I had written it as calls in arrears, which is my asset. When I forfeit the share, I can no longer ask him for money. So this 7 rupees will no longer be received. When I made the call, he did not pay. I recorded it as an asset debit. Now this 7 rupees has to be credited. Calls in arrears for 900 shares, 7 rupees, 6,300. Out of 10, if he has not paid 7, is paid application money of 3. When I forfeit his share, I won't return that 3 rupees back to him. That 3 rupees, what I won't return back to the shareholder on forfeiture, will be transferred to a temporary account called share forfeiture. On reissue of this shares forfeited, if it turns out to be profit, it will be transferred to capital reserve. So I'll write money received from the shareholder in the past, which will be forfeited and not returned or not refunded back to the shareholder, is 900 into 3, 2,700. By this, I have finished forfeiture of the shares from Varun for non-payment of allotment and call money. What's next? These shares were reissued to Nitish at rupees 8 per share. I gave the shares back to Nitish at 8. I was supposed to originally collect 10. Now I'm collecting 8. 2 rupees what I won't collect is discount. Share is of 10. I'm reissuing it to Nitish and collecting 8. 2 rupees what I won't collect from Nitish will become discount. Such a discount on reissue of forfeited shares should be adjusted against the same share forfeiture balance that we created in the past. Let me write the entry. Bank account debit. 900 shares were forfeited. I am reissuing all the shares. 900 into 8. That becomes 7,200. I'll credit my share capital. 900 shares will be fully paid up to the extent of 10, making it 9,000. So 7,200 rupees cash received. 9,000 rupees is increase in share capital. 1,800. The extent to which I made the call, but I won't receive. That is 2 rupees discount per share for 900 shares. Discount on reissue of forfeited shares will be adjusted against share forfeiture account. Any excess balance remaining in share forfeiture account will be profit to be transferred to capital reserve as all the shares have been reissued. Observe, we had balance of 2,700 in our share forfeiture account. Of that, 1,800 rupees worth of balance is being utilized. 2,700 minus 1,800 will give us 900 rupees of money, which will be transferred from share forfeiture to capital reserve. I'll teach you how alternatively you can compute the same 900 in a different way. Varun, our old shareholder, had paid rupees 3, and Nitish, our new shareholder, paid rupees 8. Varun paid 3, Nitish paid 8. 8 plus 3. Together I have collected 11 rupees. When I have collected 11 rupees, the nominal value of the share is actually 10. I have collected 1 rupee extra. That 1 rupee that I have collected more is profit. 1 rupees per share for 900 shares, it is 900. I'll repeat, 3 rupees, Varun has paid, 8 rupees, Nitish has paid, 3 plus 8, 11, nominal value 10, profit on reissue of share 1 per share, multiplied by 900 shares, 900 rupees. You can do it slightly differently. Now, Varun had paid 3, so I can offer discount of 3 rupees to Nitish. Varun had paid us 3 rupees. I can offer discount of 3 rupees to Nitish, but I offered only 2 rupees as discount. Out of 3 rupees, which is maximum discount, I offered only 2. 1 rupee discount that I did not offer will become profit multiplied by 900 shares, and that becomes profit on reissue of forfeited shares to be transferred to capital reserve. By this, we're done with 15, sub-question 1. But 15 had 2 sub-questions. Let's solve the second one. What's happening in the second one? A Limited forfeited 200 shares of rupees 10 each. 7 called up. So the moment it is 7 called up, remember you would have to ignore 10. 10 is of no use. So 200 shares of rupees 7, on which Kamal had paid application and allotment money of 5. 5 rupees is received. When you forfeit this, your share capital will decrease not for 10 rupees, but it will decrease for 7. Share capital account debit will be 200 into 7, 1,400. And out of 7, he has paid 5. So he's not paid 2. 2 rupees what Kamal did not pay. We had debited it to calls in arrears as our asset. Now that asset will no longer exist. I can no longer ask him money because I've already forfeited the share. I'll credit calls in arrears 200 into 2, 400. And the money that he had paid was 5 on application and allotment, 5 rupees per share for 200 shares, 1,000 rupees whatever I had collected in the past is not of the money which I am refunding back to him. Money which I collected, which I am not refunding on forfeiture, is like profit to be credited to share forfeiture account. So the journal entry is share capital account debit 1,400, to calls in arrears 400, to share forfeiture 1,000. By this I am done with share capital, 2 calls in arrears, 2 share forfeiture. Then I am reissuing it, but this is slightly unique from the previous case. In the previous case, we reissued all the shares. In this case, we are reissuing only 150 shares. We had forfeited 200. We are reissuing 150 shares. 150 shares are reissued at rupees 6. Write the entry. Bank account debit 150 into 6 becomes 900. These shares have been reissued with fully paid up or partly paid up. As fully paid up, meaning share capital account credit will be 150 shares into 10, not 7, 1,500. When I reissued shares of nominal value 1,500, I was supposed to collect 1,500, but I collected only 900. 600 rupees what I did not collect will become discount on reissue to be debited to share forfeiture account. Now I need to compute the profit to be transferred to capital reserve. Remember, don't do 1,000 minus 600, 400.
It will give you wrong answer because you forfeited 200 shares, you reissued only 150. So your forfeiture balance is 200 shares into 5. Am I right? So in this, only 150 are reissued. Take 150 into 5. How much is 150 into 5? That is 750 rupees was collected previously against 150 shares, which are now forfeited and reissued, but the money was not refunded. Out of this 150, 600 of share forfeiture is utilized. 150 rupees has to be transferred from share forfeiture to capital reserve. If it doesn't make sense, I'll teach you in two more ways. Focus. Old shareholder had paid 5. He did not pay 2. So old shareholder paid us 5. New shareholder paid us 6. Old shareholder paid 5. New shareholder paid 6. 5 plus 6. I've collected 11 rupees. Whereas the nominal value of the share is 10. 1 rupee that I've collected extra will become profit. On how many shares? 150 shares. Don't take it on 200 because only 150 shares are reissued. 150 shares into 1 is 150. That's the profit on reissue to be transferred to capital reserve. One method. Another method. Previously, we received 2 rupees on the shares which were forfeited, which we did not refund. So 2 rupees we have received from the old shareholder. Sorry. So 5 rupees we have received from the old shareholder, which we did not refund. So 5 is the maximum discount that I can offer on reissue. For a 10 rupee share, I collected 6, which means I gave discount of 4. Maximum discount that I could have offered 5. Discount I offered 4. So out of 5, if I deduct 4, 1 rupee discount which I did not give will become profit. Multiply this not with 200 shares, but with 150 shares which are reissued. 150 shares into 1 will become 150 rupees as profit on reissue of forfeited shares. Our 15.1 is done. 15.2 is also done on forfeiture and reissue. Let's now start with question number 16 from our RTP Jan 2026 issued by ICAI for CA Foundation Accounting. This question number 16 is from the topic of issue and redemption of debentures. We don't have much of debentures issue here. We're basically dealing with how to convert debentures partly to cash and partly to equity shares. That is redemption of debentures partly by settlement in cash and partly by conversion into equity shares. Purely from the topic of redemption of debentures. Let's start. A company had issued, already issue is done, 80,000 12% debentures of rupees 100 each on 1st of April 2021. The debentures were due for redemption on 1st of March 2025. The terms of issue of debentures provided that they were redeemable at premium of 5%. So these debentures who have nominal value 100, on redemption, I can't pay them 100. I am forced to pay them 105. The company offered an option to debenture holders to convert. It's an option given. If a debenture opts for it, he'll be given equity share in the place of debenture. If he says, no, I want cash, we will give them cash. It's a small trick. To convert redeemable value 20% of their holding of the equity shares. Holding to equity shares. Meaning, if I opt, I won't get 100% of my holding in debentures into equity shares. The conversion is not 100%. If I opt, then 20% of my holding will become equity shares. 80% will still be settled in cash only. And nominal value of equity shares is 10 at a predetermined issue price of 15. So it will be settled at, the equity shares will be issued to settle debentures at a price of 15, 1, 5. And payment in cash for remaining debentures. Okay. 100 debenture holders holding totally 10,000 debentures did not exercise the option. Oh, they don't want equity shares. They want cash. They want us to compute the total equity shares allotted and total cash paid. They have not asked accounting entries, but we have done this in the class. In these kind of questions, they can actually ask you to pass journal entries also. To begin with, we have 80,000 convertible debentures of rupees 100 each, which comes to 80 lakh. We have told our debenture holders, if you want, I will give you equity shares. If not, I'll give you cash. If you want equity shares, and I'll not give you full equity shares, I'll give only 80% equity shares. Sorry, 20% equity shares. 80% settlement will anyways happen by cash. In this, one debenture holder who's holding 10,000 debentures opted for cash. 10,000 debentures, each debenture is 100. Can I say 10 lakh rupees?
This 10 lakh rupees is settled by issue of cash. And when we say cash, we have to remember nominal value of debentures is 10 lakh. We have to pay them premium on redemption. That's been told in the question. Redemption happens at a premium of 5%. So how much is 5% of 10 lakh? That comes to be 50,000. I need to pay them 10 lakh 50,000 by cash. This is pure cash. Out of 80,000 convertible debentures, if 10,000 debenture holders expect cash completely, 70,000 debentures have opted for conversion. Debenture holders holding 70,000 debentures of 100 each, which totals to rupees 70 lakh, have opted for conversion of debentures into equity shares. But we won't give full 70,000 debentures worth of equity shares to them. Only 20%. Observe this. Convertible portion is 20%. Can I say 20% of 70,000 debentures is 14,000 debentures? Against 14,000 debentures, each of it being 100, it comes to 14 lakh. I will give equity shares. And against the balance 80%, that is 70 minus 14,000, 56,000, or 70,000 into 80%, which is 56,000 debentures of rupees 100 each, coming up to 56 lakh rupees. I'll give them cash. Remember, 56 lakh is again nominal value only. On this, I'm supposed to pay them premium of 5 per debenture or 5%, which comes to 2 lakh 80. I end up paying 58 lakh 80,000 redemption value in cash to those debenture holders who opt for conversion. This is because even if the debenture holder opts for conversion, not the entire percent of his holding is converted into equity shares. Only 20% is converted to equity shares. Balance 80% has to be and will be settled by cash. We are done with this. This is cash paid 58 lakh 80, cash paid 10 lakh 50. Here, the nominal value comes to 14 lakh. On redemption, we have to pay premium 5%. I'll add that 5%, 70,000, making it 14 lakh 70,000 as redemption value. If I was giving cash, I would have given 14 lakh 70. I'm issuing equity shares to them. When I issue them equity shares, each equity share is of 10, but it is issued at 15. So to identify number of equity shares issued, I need to divide 14 lakh 70,000 by issue price of 15. 14 lakh 70,000 divided by issue price of 15 gives us 98,000 shares. So can I say number of equity shares issued is 98,000. We are basically issuing 98,000 equity shares of rupees 10 each at a premium of 5, making it 14 lakh 70,000 worth of debentures being converted to equity shares. There is premium on redemption. There is also premium on issue of equity shares. The actual answer ends here, but I will go forward to prepare journal entries for the same. To do this now, I'll write that we have issued 98,000 equity shares of rupees 10 each at a premium of 5, making it 14 lakh 70. And we've also given cash. How much cash? 58 lakh 80 and 10 lakh 50 together. Together we paid cash of 69 lakh 30,000. And this is how the settlement has happened. Let's write the entries. Debenture nominal value 80 lakh is reducing. I'll debit 12% convertible debenture by 80 lakh. And to these debenture holders, I'm also supposed to pay a premium. I'll compute on 80 lakh 5% and I'll debit it. 4 lakh of premium I need to pay. So basically, I am supposed to pay my debenture holder 84 lakh. 80 lakh nominal value towards their debentures, 4 lakh premium. I'm supposed to pay them 84 lakh. However, on the payment, I'll debit debenture holder by 84 lakh. Not everyone is paid by cash. Not everyone is settled by equity of issue of equity shares. Partly cash, partly issue of equity share, and issue of equity share along with premium. So my credit will be cash account, equity share capital account, as well as security premium. Let me credit cash or bank account. I am paying cash of 69 lakh 30,000. Let me write that. To equity share capital account, I am issuing 98,000 shares. Don't write 1470 because 1470 includes premium. I am issuing 98,000 shares of rupees 10 each. That comes to 9 lakh 80. And same shares are issued at premium. 4 lakh 90 will be returned to security premium. And that's the end of the accounting entries for redemption of debentures by way of conversion and partly settlement in cash. Let's now start solving question number 17 from our RTP Jan 2026. This question is on redemption of preference shares, company accounts unit. Let's start reading the question. The following balances appeared in the books of Silverstone Limited. That's the name of the company. They've given us preference shares. If you have a look, 10% preference shares of the company are of nominal value 100 each, but these preference shares are paid up only to the extent of 75. I know it, you know it, we all know it, that we can never redeem preference shares if they are partly paid up. To do redemption, the shares have to be fully paid up. If they're already fully paid up, we'll proceed with redemption. If they've not been fully paid up, we have to make the call for the balance 25, receive that money. Only and only if the 25 rupees is received, we will proceed to redeem the preference shares. Otherwise, I'm sorry. We can do forfeiture, but we can't do redemption. Let's continue. Under the terms of their issue, preference shares are redeemable on 31st March at a premium of 5%. Let's provide for the same. And this premium payable on preference shares cannot be taken from security premium. It has to be from profit. You can take P&L account. In the question, they've not given P&L, they've given general reserve, debit general reserve. In order to finance the redemption, company is making right issue. Okay. Company is issuing 1,20,000 equity shares of rupees 100 each at a premium of 10%. 25 on application, 45 on allotment. Let's proceed with this. What you have to remember is, if the complete funding of the redemption of preference shares had come from pocket, that is on sale of investments or on the cash that we have, then we have to create CRR to the full value of nominal value of preference shares redeemed. But in this case, to the extent equity share capital is increasing by issue of shares, I don't have to create CRR. The extent to which preference share capital is decreasing, which is not compensated by equity shares issued, for that difference, I have to create CRR, and CRR will be created using general reserve. Then allotment dates have been given. Preference shares have been redeemed after fulfilling necessary conditions. So first we'll make the call, receive the call money, then pass the preference share capital redemption due entry by transferring it to preference share holder, including premium. Then I'll make right issue, application allotment, and then call. I'll receive the right shares money, and then I'll pay to my preference shareholders. I'll also adjust my premium on redemption with general reserve, and finally create CRR for the difference between capitals. And I think that's it. They've asked you to prepare journals, and they also want you to prepare notes to accounts for share capital and reserves and surplus. Why waste time? Let's begin. To begin with, when you make the call, entry will be preference share call account, because you're supposed to receive money there, and credit preference share capital. It is 10% preference share capital being share call made. How much? You're making call to the extent of 25 rupees per share for 16 lakh shares. Very good. Let's write 16 lakh shares. 16 lakh shares into rupees 25 per share. This is the extent to which we're making the call, which comes to 40 lakh. Am I right? Let's just check. Yeah, 40 lakh. That's absolutely perfect. Then I would receive this money. I'll write bank account debit to preference share final call. 40 lakh, 40 lakh. I've made the call. I've received the money. Now my preference shares are due for redemption. It is 10% preference share capital that will be debited, but its full value. That is 16 lakh shares into rupees 100, which comes to 1 crore 60 lakh. But what I'm supposed to pay my preference shareholder is not limited to 1 crore 60 lakh. I might have to pay them slightly more for the premium. So I'll debit premium on redemption of preference shares account also debit. This is to the extent of 5%. 1 crore 60 lakh into 5%, 8 lakh. Basically, I need to pay my preference shareholder 1 crore 68 lakh. And how do I pay this? By cash. But to pay, I made right issue. I cannot write payment entry now. First, I would have to issue right shares and collect the money. Only then such money will be used to pay my preference shareholder. Right issue is happening like this. 1,20,000 shares of rupees 100 each. Premium 10%. So basically, issue price is 110. 25 rupees being payable on application. So I'll write the entry bank account debit to equity share application. I have collected for 1,20,000 applications into rupees 25. So let me write 1,20,000 shares into rupees 25 per share. This comes to be 30 lakh. And once I write 1 crore, 1,20,000 into 25, 30 lakh, 30 lakh. This application money I'll transfer it to my share capital by rating equity share application account debit to equity share capital 30 lakh, 30 lakh. Then I'll make allotment. At allotment stage, I'm supposed to collect 45, and that 45 will include premium. How much premium? 10 rupees. Because nominal value is 100 and premium is 10%. I'll write the entry equity share allotment account debit. That's for the money receivable. On 1,20,000 shares, I'm supposed to receive 45 per share, which comes to be 54 lakh. Out of this 54 lakh, portion of this will go to equity share capital. A portion of this will go to security premium. How much will go to equity share capital? On 1,20,000 shares, will transfer 10 rupees to security premium, and other than 10 rupees, whatever is there is towards my capital. So 12 lakh rupees will go towards my security premium, and balance 35 rupees will go towards my share capital. This is allotment made, money due yet to be received. They've told it is received, so I'll make the entry for receipt as bank account debit to share allotment account. This is to the extent of 54 lakh. Now application money received, allotment made, allotment money also received. Now let's proceed with preference shareholder payment. We wrote it just 2 entries ago that I need to pay my preference shareholder 1 crore 68 lakh. Now that I've made right issue, I have enough money. I'll pay preference shareholder by debiting preference shareholder account 1 crore 68 lakh. It's a liability decreasing debited, and I'll credit bank account because the money is paid and my capital is decreasing. My cash is decreasing. After the payment to preference shareholder, I need to do 2 things. One, I need to write off this premium on redemption of preference shares. What was debited 8 lakh by debiting my general reserve. I'll write general reserve to premium on redemption 8 lakh 8 lakh. Done. Last entry, capital redemption reserve, that is supposed to be created under section 69 subsection 1 to ensure that the overall capital of the company cannot go down irrespective of the fact whether you do redemption or buyback. Redemption as in what you read in your CA foundation, buyback what you will read in CA intermediate. We'll be waiting to see you there. Anyways, come here. Your equity share capital is increasing by 30 lakh and 42 lakh. I have credited it 2 times, 30 and 42. Equity share capital is increasing by 72 lakh rupees. 30 on application, 42 on allotment. And preference share capital is decreasing by 1 crore 60 lakh. And 1 crore 60 lakh minus 72 lakh. The difference will come down to 88 lakh. That is the extent to which I will create my capital redemption reserve. That's the extent to which my capital is reducing because of redemption of preference shares, which is not compensated by issue of equity shares. So capital of the company cannot reduce otherwise than by reduction, which is given in internal reconstruction, which is a chapter in CA Inter. So for this reduction in my capital, I'll create CRR, which will be later used for bonus issue, which will increase my capital back to the original limit. And this is it. By this, we are done with journal entries. However, they've asked us to do notes to accounts also. To begin with authorized capital, which I have no clue about, I'll just leave it blank. Then I'll write issued share capital. I've issued right shares just now. And before that, have they given us any equity? Yeah, we have 4 lakh equity shares of rupees 100 each. I would write that exactly the same way. 4 lakh equity shares of rupees 100 each, 4 crore, same to same. We issued 1,20,000 right shares of rupees 100. I've collected 25 on application. I've collected 45 on allotment. In the 10 is premium. So I've collected 35. 35 plus 25, I've collected 60 rupees. So I would write 1,20,000 shares have been issued on rights, which is equity shares, of rupees 100, but only 60 rupees is paid up. 72 lakh, 4 crore 72 lakh is the equity share capital. In the notes to accounts given in the question, there is preference share capital, but this has been redeemed, which will no longer exist. So this is done. Now going to reserves and surplus. To begin with, security premium 13 lakh. I have security premium 13. I'll write it in the inner column. During the year, when I issued my equity shares, I've issued them at premium of 12 lakh. I'll consider that 12. I'll add that 12 lakh to this, make this 25 lakh. So during the year, equity shares which were issued as rights have been issued at premium. That will increase my security premium. After security premium, I have with me capital redemption reserve, which was there to the extent of 84 lakh. But during the year, on redemption of preference shares, because the capital was dipping much more than increase, I have created CRR to the extent of 88 lakh. I will add this. As I add CRR created 88 lakh and make my CRR as 1 crore 72 lakh, I want you to remember, next when I write general reserve, I have to deduct this same 88 lakh because CRR is created out of free reserves. I take it from free reserve, put it to CRR. CRR will increase, general reserve will decrease. Next item that we have is general reserve to the extent of 1 crore 70 lakh. Very good. Out of this 1 crore 70 lakh, there are two things that's happening. Number one, my general reserve is decreasing for premium paid on redemption of preference shares, which if P&L was there, I would have deducted there. Secondly, it will also reduce for CRR that's created. 8 lakh is premium paid and 88 lakh is CRR created. If I deduct both, I'll arrive at 74 lakh. Total of this will be 2 crore 71 lakh. And this is the notes to accounts that I prepare for share capital followed by reserves and surplus as asked in the question. Now we're going to discuss question number 18 from our Jan 26 RTP. This is on short note question. My humble request to all of you preparing for your examination is not to skip short note questions. In fact, this is something that can save your attempt if in case the exam turns out to be terrible for you in those 3 hours. What you got to do is, in all the 11 chapters, pick 2-3 topics from where short note question is possible. You can definitely do this. When you pick all these topics, put together it will come to 23-24 topics. And on each of these 23-24 topics, write 4 5-line summary and read them through and go to the exam. If in case the paper turns out to be lengthy or you get stuck in any question or the adjustment turns out to be very new which you don't know, then leave that question, take up these short notes and then write those 3-4 short notes questions where scoring 4 on 4 might not be possible. Scoring 3 on 4 becomes very easy. And this might just save you an attempt and also ensure that you get into CA Inter pretty quick. On that note, let's start with question number 18. Short notes questions. Rules for posting journal entries into ledger. Simple rule to remember, for every account involved in the journal entry, we need to open a separate ledger. And items when they're represented in the ledger, we need to use two beautiful words. One, to buy. One, TO2. Second word is BY buy. When you're writing items on the debit side in the ledger, you'd have to use the word to, which is actually credit in the journal entry. In the credit side of the ledger, you will write all the debit items in the journal entry that will be represented by buy. And you need to remember, in a journal entry, the debit aspect, whatever is there, in that ledger, the credit item will appear on the debit side. And for the credit item in the journal entry, when you open ledger, that debit aspect will appear on the credit side in that ledger. That's it. You follow these 3 rules and 4 marks is yours. Next one, importance of bank reconciliation system to an industrial unit. They keep depositing checks, they keep issuing checks, they keep making standing instructions. They might have incurred a lot of banking charges. They might have collected money. The bank might have collected money on your behalf. Customers might have directly deposited. So many transactions would have happened. There is a very good possibility of some transactions being omitted or incorrectly recorded in Cashbook. Only way we can identify this is by preparing bank reconciliation statement. By comparing your passbook with Cashbook, to identify such transactions which have been incorrectly recorded or omitted to be recorded so that you can correct them to show the correct bank balance in your balance sheet. We can summarize it and write it a little long. That will be the answer. Periodic inventory system versus perpetual inventory system. When a proper accounting record is kept for every unit received, every unit issued, how many units are there in the godown can be told without opening the shutter of the godown, just by looking at the paper. That's perpetual inventory system, where every transaction of inventory coming in, going out will be recorded. If in case you count the inventory in the godown, you can verify whether it matches with the records. If it doesn't, then we can find the reason why it's missing. That's under perpetual. Under periodic, we don't do this. The day I want to know how much inventory is there in my godown, I go count it physically. Or what do? I look at my cash book and creditors account, identify how much payments are made to be made to find my purchase. Or look at invoices. I'll identify my sales by looking at my cash account, cash received, and debtors account receivable, or my sales invoices generated. I know opening inventory at the beginning of the year because I know the previous year's closing inventory. I know the profit margin, so I'll apply COGS formula to find out my closing stock. And that's periodic system. Under periodic system, there is no control. If inventory is stolen, if inventory is lost by fire, if inventory is pilfered, if there is any error done, you won't be able to catch it. You believe the inventory that's there in the godown is the right value. So, periodic inventory system is suitable where the quantity of the inventory is so huge that you can't maintain records. Whenever you can maintain records, you should follow perpetual system that's reliable, scientific, trustworthy, and gives you information comprehensively, which can be re-verified with the physical inventory. But all this is not available in periodic inventory system. However, read it in detail from your class notes so that you get a better edge in the exam. Then, trade bill versus accommodation bill. This is from bills of exchange. I have sold goods to you. You have sold goods to me. I've raised a bill on you. You signed it, accepted it, you give it back to me. Then it's a trade bill. There is a trade, purchase, sale, transaction, what has happened between two parties. And to settle the dues between both the parties, there is a bill. That is trade bill. What is accommodation of a bill? I have not sold goods to anything. You have not sold goods to me. We don't owe money to each other. But we both want money. So we will act like I've sold goods to you. You purchased goods from me. I will raise an invoice. You will assume that you purchased goods from me and you sign that bill and then give it back to me as if there is a trade transaction between us. But genuinely speaking, there is no trade between us. You sign that bill and send it back to me. I take that bill, discount it with the banker only to share the discounting proceeds with you. And on the maturity date, when the banker comes back, you pay the money to the banker. You never tell the banker that we did not have trade between. And whatever money you're supposed to pay to the banker, a part of it I'll contribute. So basically, it's a financial arrangement. Trade bill is backed by a genuine purchase sale trade transaction. Accommodation of a bill is a financial arrangement between two parties wherein they pretend that they have trade, raise a bill, and then accept the bill, discount it to share the proceeds. Where in reality, there is no such trade transaction between them. Next one, we have contingent asset and contingent liability. These are not assets, not liabilities, but these are potential assets and potential liabilities. To start with contingent liability, it is a obligation which might or might not materialize. It is dependent upon occurrence or non-occurrence of one or more future events which are uncertain, uncontrollable, and not in our control, and we are not very sure of it. Same thing, whereas contingent asset is dependent upon occurrence or non-occurrence of one or more future events, and this contingent asset, if the ruling is in our favor, it results in inflow of cash. Contingent liability, if the ruling is in their favor, actually it results in outflow of cash. If you expect to receive the money on happening of a certain event, it is asset. If you expect to pay the money on happening of a certain event, that ends up being contingent liability. I've tried my best adding a lot of value to your preparation by discussing this RTP in detail. I cannot promise you that these RTP questions come in the examination. That's the reason I didn't just go through answer or just tell to the point answer. I've discussed it in detail and I've told you every concept that can come around it because I believe that you deserve everything and nothing less, and you deserve to clear the examination when you're writing up next. So we'll wait very eagerly to see you all in CA Inter. Till then, stay in the game. And before you go away, let me know in the comments if this was helpful, or let me know if you need any other topic video from CA Foundation or Inter.
These are some tips that I would want all of you to remember in your exam preparation in this last hour. I'll tell it topic wise. Let's quickly start with chapter 1, theoretical framework. When you're doing theoretical framework, meaning and scope of accounting, don't focus on the definition, but remember limitations, functions, and measurement principles. That limitations, characteristic features, and functions part, please do read that without fail. If there is a short note question on it, it's an easy scoring topic. And accounting concepts and conventions, remember to read concepts and conventions with an intention of including that in your answer for true or false. When you get a true or false questions, you might have to write that full concept in your true or false. And the second point is, sometimes they end up asking you difference between question, difference between going concern and cost concept. There is no difference between them, they are very different. Just write definition of going concern or concept going concern, whatever you know, money measurement, whatever you know, or cost concept, whatever you know. Write it in the T format or one below the other format. So be ready to answer concepts in difference between questions and also include it in your true or false questions. From capital and revenue, they give a list of items, 4 items, 5 items, and ask you to tell whether is it capital or revenue. There are times where they have given 8 of these and asked you for 4 marks. And there are also times where they have given you 4 of this and asked you for 2 marks. Sometimes they'll give for half mark, 50 paise. for each item. Sometimes they'll give 1 mark for one item. Are you getting it? And there is a chance that they might include this capital revenue portion in your true or false also. So be ready to do that. With regard to true or false, we've done one small true or false marathon. List of true or false which come in all the past RTPs put together at one place. Yeah, it's like in the quiz format like KBC. So please do ask. That will also be there in the same place. If you guys want, you can do that as addition to your existing preparation. Then with regard to contingent assets and contingent liabilities, in definition, they can ask what is contingent asset definition, what is contingent liability definition, and what do you mean by provision. So be careful about that. Accounting policies can be taken much lightly. Other than the definition, nothing else might come. But if they do ask, they can ask what are the problems with accounting policies. No comparability, no uniformity, no standardization, difficulty in picking. What is the solution for accounting policies? Accounting standards. And with regard to valuation principles, know that what is historical cost, what is retail, what is current cost, what is replacement price, what is present value. Those 4 words, remember them, important in short notes questions. Then accounting standards, not much needed. And accounting process, journal entry based questions can be asked in GST based journal entries. Otherwise, straight journal entry questions if they ask, it's lottery. You should be very happy. Otherwise, usually if it case it has to become complicated, it will be GST based journal entries, which again we'll discuss separately in detail. Whoever wants it can take that part also. Then ledgers, it will be part of a bigger question. Trial balance, don't ignore types of trial balance. Don't ignore that trial balance what we prepare under total method, trial balance what we prepare under balance method, total and balance method, those kind of questions you don't forget. They can sometimes ask a question where they've given an incorrect trial balance, they want you to rectify the trial balance. Debtors amount is given on the credit side, creditors amount is given on the debit side, closing stock is given in the trial balance. You need to redraft the trial balance by correcting it. Such question also you should be prepared. And subsidiary books, purchase book, sales book with the discount and GST portion, very interesting questions, easy to do. And cash book also be ready to do if in case you get a question on cash book. When you do questions on cash book, remember one blind thumb rule what ICA wants you to follow. Whenever a check is received, treat it as cash receipt. Whenever the check is deposited, that's when you'll call it as bank deposit. When the check is received, write in cash column. Next day when the check is deposited, then you write in the bank column debit side or receipt side, and then in the cash column credit side. I hope you got it. Don't total discount column. Leave the discount column untotaled. Receipt side is not discount received. Receipt side is discount alone. Payment side is not discount paid. It is discount received income. So credit side or payment side represents discount income. Debit side represents discount expense discount alone. That's what I want you to know. Petty cash book, don't mug up the format. In the question, whatever expenses are given, please write only those expenses in your petty cash book. Talking about rectification of errors, usually people end up doing mistake because you don't identify the stage at which the error has happened. So question will evidently tell, is it after final accounts or is it before final accounts? Read that and then take care of it. If it is after final accounts, remember to replace nominal accounts with P&L adjustment account. And after you do stage 3 rectification, close your P&L adjustment account. Close your P&L adjustment account by transferring the balance to capital account. And also don't forget that if in case last year when the trial balance did not tally, they should have transferred the balance to suspense. If they've incorrectly transferred it to P&L, which is indirectly went to capital, then in the journal entries wherever you use suspense, close the suspense account also by transfer to capital, like how you do with regard to P&L adjustment. We have a question on this, Mr. Roy question. Mr. Roy, illustration number 8 in ICAI study material. You can try that question with regard to the adjustment that I told. Bank reconciliation statement. Remember, you will do adjusted cash book only if they ask. We need to classify the differences into what are timing, what are non-timing. Timing are only two. What are they? Checks issued but not cleared, checks deposited but not cleared. Third one is error in passbook. Other than that, direct deposit not recorded, overcasted cash book, bank charges not recorded in cash book, bank interest not recorded in passbook. All of these are non-timing differences, meaning errors. Errors have to be rectified in cash book. Cash book was already done. So we reopen the cash book. That is the reason we call it amended cash book or adjusted cash book. The order is first you would have to prepare amended or adjusted cash book. Once you find the balance as per amended or adjusted cash book, that amended or adjusted cash book balance will go to BRS. And in BRS, whenever we have information, we should always start with balance as per cash book. Only after we finish with balance as per cash book, we end up with balance as per passbook. In a rare circumstance, when the balance as per cash book is not available, then we'll start with balance as per passbook. In the September 25 examination, they wanted us to do amended cash book, but they did not give cash book balance. What did we have to do in that case? Start with balance as per passbook, find balance as per cash book, use balance as per cash book, prepare amended cash book. You will get the amended cash book balance, use that, and then prepare the BRS again, comprising of only timing differences to write and find balance as per passbook. The same video we have solved September 25 paper, you can actually watch that. Then with regard to inventory, remember FIFO, LIFO, SAM, WAM based problems, what you have big ones are perpetual. What you do in short using formula is called periodical. Do the theory difference between periodic and perpetual, and also do problems on periodic, what do you say, stock reconciliation. When the stock taking happened before the year end, when the stock taking happened after the year end. If it happened before, add inflow, deduct outflow. If it happened after, add outflow, deduct inflow. When you're dealing with outflow, by outflow I mean sales, by inflow I mean purchase. With regard to outflow sales, remember to adjust it at cost of goods sold, that is after deducting sales return and profit involved in the same. With regard to goods sent on return or approval, you only sent the goods, you have not sold the goods. If it is yours, you have sent it to somebody, it belongs to you, it should be included. If it is already there in your godown on the date of counting, no need to add. If it is not there in your godown on the date of counting, add it at cost. And consignment, if you have sent goods on consignment, though it is sent, it is still yours. If it is there in the third party's godown on the date of counting, add it to your stock. If it is already there in your godown, no problem. This is when you are sending. What if you have received consignment goods from somebody, it's not yours, it should not be included in your inventory. If you have wrongly included on the date of stock taking, deduct it to find the correct closing stock. Don't skip adjusted selling price method, please do it. It is simple, ratio proportion kind of question. For this much cost, this much is the selling price. For this much selling price, how much is the cost? Just cross multiplication and you will get the answer. Please do inventories adjusted selling price. Depreciation and amortization, remember to give equal weightage and importance to all the methods of depreciation. Do sum of parts method, depletion method, production units method, machinery rate method also. Remember, change in useful life, change in method of depreciation or change in scrap value should all be given prospective effect, not retrospective effect. Then amortization also similar to depreciation only, but you will write the name as amortization. Amortization is on intangible assets and depreciation is on tangible assets. Then talking about bills of exchange and promissory note. Remember to read the basic theory, difference between bills of exchange and promissory note. Journal entries in various circumstances. If you master the journal entries in various circumstances, you will be able to counter your mixed journals and accommodation also. And remember the types of bills and computation of due date, maturity date based questions. Because it's been long time due, they've not asked any questions where you have to compute maturity date or due date. Sometime in the exam that will come. And the second reason is in journal based questions, sometimes they expect you to write date column. If you write the date incorrectly, they won't give marks. So with that reason in mind, remember to practice due date, maturity date computation with holiday in mind. Then preparation of sole proprietorship, non-manufacturing manufacturing entities along with financial statements of NPO and incomplete records, all are like-minded chapters. Don't tell you will do 2 chapters out of these 3 or 1 chapter out of these 3. If anyone is doing selective learning, it is really bad to do 1 out of these 3 or not do any of the 3. If you're skipping, skip all 3. If you're doing, do all 3. All the 3 are like-minded chapters. They go hand in hand. You just have to get the feeler of it. Remember, don't try to use any shortcut. This is not QA paper. This is not economics paper. QA faculty and economics faculty would have taught you lot of ways in which you can get the answer out of ABCD quickly. That is right for that paper. In accounts paper, which is descriptive, working note forms part of the answer. Working note has marks and you have to dedicatedly devote some time for working note. Skipping working note and trying to finish the paper much early in time might cost you 3 months. Prepare ledger account whenever the need be. Whenever there is outstanding, accrued, prepaid, don't do plus minus. This is not mathematics. In QA, do you do debit credit? No. In account, you should do debit credit. In QA, you do plus minus. And trust me, I'm telling you, with little experience that I have and little bit of student interaction that I've had, it will not take more time. It's just a psychological factor that makes you feel that ledger takes more time, plus minus takes lesser time. It is not. Then, with regard to incomplete records, remember to practice both the types of problems. Statement of affairs method, that is incomplete records maintained as incomplete only, as well as conversion of single entry to double entry. Partnership part, remember not to leave the smallest of the parts like interest on drawings, interest on capital, as well as fixed capital system, fluctuating capital system, adjusting for partner with minimum guarantee. All of these small things also be little cautious, don't skip them. With regard to goodwill, there are multiple methods. I want to say simple average, weighted average, super profit, capitalization, annuity. Do all of them. Remember to not compute ratios for goodwill. Remember to adjust it using the table like how we did. And you would have seen some questions that we solved in the class also would have done the same way. Apply that method. And talking about death of a partner, remember the payments have to be made and computed till the date of death. If the death happens in the middle of the year, profit will be computed on approximate basis and it will be taken away from P&L adjustment and credited to the deceased partner. Section 37, you don't forget. The deceased partner, payment has to be made or agreement has to be made. If you don't make payment and if you don't even agree how much to pay and how to pay, then the deceased partner's dependents are eligible for payments in proportion to the profit for the capital that is left out or interest at 6%, whichever is more beneficial to the deceased partner's portion. Done. And dissolution, don't skip piecemeal distribution. It is very simple, and maximum loss method and highest relative surplus capital method are not two different methods. It's the same problem seen from two different perspectives. If you know one, the other is easy. And Garner versus Murray questions in all the possible cases where one of them is insolvent, more than one is insolvent, and deficiency based accounting. Please do solve problems in all of that cases. There's one small teeny tiny portion in the beginning which talks about premium to be paid to the partner or premium to be not paid to the partner in the case of dissolution. It's there in the book. Please do check that portion out, and that's with regard to dissolution of partnership firms. Entire partnership as a whole, don't skip JLP treatment. JLP treatments are crucial. It can come as a part of a bigger problem. So JLP in the case of admission, JLP in the case of retirement, JLP in the case of death, as well as dissolution. In short, if I have to tell you in 1 minute, if in case the partner dies, you receive sum assured. If in case the partner retires, you receive surrender value. The money that is received will belong to firm. Firm will keep it, and if it is profit, it will be shared to all the partners in profit sharing ratio. If JLP is treated as asset, the surrender value recorded in the balance sheet will be compared with the money that we receive on the policy. If we receive more profit, share the profit to partners. If we receive same, no profit, no loss. What if there is no asset in balance sheet? Entire money received from the insurance company is profit, share it to all the partners in profit sharing ratio. If there is JLP reserve in the balance sheet, treat it like just another reserve. Are you getting it? Then company accounts portion, introduction, be ready to cover some basic points of theory, characteristic features of company, because if in case they choose to ask short note question, might come from there. Then with regard to issue, forfeiture and reissue, be ready, practice with pro-rata based question, calls in advance, calls in arrears, and reissue, forfeiture, capital reserve computation, how much is profit, how much is premium. We discussed it at large in this marathon only. Please do watch that portion once again. When you're watching marathon, whatever the minute and second you find important, you write it on your paper in the book so that if you have to watch again just the day before exam or 2 3 days before exam, you don't have to search for the timestamp. You can see that specific timestamp what you find very interesting or irritating or difficult, whatever. Then with regard to issue of debentures, remember the treatment of premium on redemption and discount on issue together to be called as loss on issue of debentures. Such loss on issue of debentures will be debited by transferring to P&L account not in 1 year but over the period of debentures, and it's not equal every year. It is depending upon the outstanding debenture ratio at the beginning of the year. That one part if you crack, issue of debentures portion is done. And accounting on bonus issue and right issue, remember the bonus issue portions, journal entry, the utilization of reserves will be CRR, security premium, capital reserve, general reserve, PL. Security premium and capital reserve can be used only if it is realized in cash. Entry will be reserves to bonus, bonus to share capital. And bonus issue can be made only if the share is fully paid up. If the share is partly paid up, you can convert it to fully paid up by bonus, But when you're doing it, you cannot use CRR and security premium. Mandatory to disclose in the balance sheet when the shares are issued for non-cash consideration. Redemption of preference shares can happen out of the existing cash in the company or can happen by fresh issue. Whenever it happens using the existing funds, you have to create CRR, capital redemption reserve, to the extent of decrease. If they tell how many shares are to be issued, good. If they don't tell and we have to find, remember, sometimes if there is shortage in reserve, divided by nominal value. If the shortage is in cash, divided by issue price. We have discussed it in large in this very video. You can watch it in detail there. And share preference share can be redeemed only if it is fully paid up. If a partly paid up share is given in the question and they ask you to redeem, what do? First you make the share call, receive the money, and then make the redemption after creating CRR. Finally, redemption of debentures. Remember, DRR is to be maintained at 10%, DRRI is to be maintained at 15%. If it is not maintained, first take from general reserve, create DRR, then take from cash, create DRRI, then write debenture to debenture holder, premium if it is there, you debit it, then pay the debenture holder by writing debenture holder to cash. Finally, DRR, which is no longer required, will be reversed. Before you do redemption, you sell DRR. Order is 1. Create, check DRR and DRRI 1 and 2. 3. Sell DRRI. 4. Redeem debentures. Pay debenture holders and then transfer that premium to P&L if not. Lastly, 6th point is that DRR, whatever is maintained which is no longer required, will be transferred back to general reserve. This is what I want you all to note in this preparation. And like devotedly, lot of you have been sitting here in the class for the last 3-4 days and then attending the lecture. All of you were watching it online. It wasn't easy. It should have been not easy sitting for such long hours and then watching. If you can force yourself to sit for such long hours listening to someone trying to help you, you should also be trying to continue this entire pattern and sit for such long hours and then study. This is a revision video. I would want to put a lot of subject in it. I don't want to put any, how to say, motivation in it. If you people have taken this course of chartered accountancy, you should be self-motivated. Yeah, but all that I would want to tell you, is simplest trick to pass the examination is study, period. That's it. Only trick that will make you help you pass is study. Yeah, more you do, more chances of passing. Less you do, less chance of passing. Zero you do, zero chances of passing. More you study, more chance of passing. So that's one simple tip from my side. Study hard, study long, do well, pass the examination for your sake, not for me or not for anybody else. I am proud of what I do. I don't want to be more proud because you did well or something. No. Remember that you're doing it for you and not for anybody else. Do it like how you're doing it for yourself and not for anybody. And that's it. See you all in CA intermediate.